Happy morning, people. Welcome to the first session of CA Inter FM Marathon. All right. So before I dive into the topic, I'll give you a quick overview as to what we'll be doing from this particular session. It's going to be a 3-day session, people. Okay. And the timings for this session, I'm planning for 7:30 to probably 3ish. Okay. 3:30 also it may become. Every day we have a certain topics as a target. We will finish that, then we will leave for the day. Okay, like this we will catch up for 3 days and complete the FM ka syllabus. That's our particular motto. Okay, so through this session conceptually we will revise all the concepts of FM. Problems depending on the time I'll pick it up. Okay, two problems per topic, 5 problems depending on the availability of time. We'll go on taking number of questions. So that's the brief agenda of this particular marathon session. Okay, Saru? All right. So now without wasting the time, can we dive into the topic? Okay, the first topic we are starting with is cost of capital. All right, C4, chapter number 4 in our class notes, cost of capital. Sir, if you want to do any business, you need money. Yeah, right? If you want to start any business, we need funds. Now I need, suppose 50 lakh rupees funds. Will the bank give me this 50 lakh rupees at free of cost, or they will charge some interest? Charge some interest, correct? That means every capital will have a cost. Capital here refers to money taken. Capital here refers to the money taken. Whatever money you take will have a cost. That particular cost only is what we are trying to find out in this particular topic. 1 minute, bacha. New software, no? Getting used to it. Yeah, better. All right. So that particular cost of finance only is what we are trying to find out in this particular topic. Yes. So broadly, the scope of this particular topic is 6 cost of capital we need to find, or there are 6 things we need to work out here. Cost of debt, cost of preference shares, cost of retained earnings, cost of equity, marginal cost of capital, and overall cost of capital. 6 things if you find means this particular chapter is dumber. That's all as the scope. Okay, can we dive into further? All right, so what is again cost of capital? Cost of capital is simply nothing but where the company to run the funds, they have to take finance. That all that finance will have a cost. That cost only we're trying to find. Sir, why do we need to find it, sir? Suppose a company issued 10% debentures for 10 lakh. This debentures carries interest rate of how much? 10%. How much money has the company issued debentures for? 10 lakh. Sir, isn't 10% only the cost? Isn't 10% only the cost? No, sir. Why, sir? Sir, on interest is an expense. On expense, what do you get? Tax benefit. On expenses, you always get the tax benefit. Like here, just let's say, you know this format, no? EBIT, earnings before interest and taxes, 1 lakh. All right. Let's assume that there is no interest scenario. The company does not have any interest. EBIT is how much? 1 lakh. That means will the interest be there or interest is 0? Interest is 0. That means what is earnings before tax? 1 lakh. Let's say company pays tax at the rate of 30%. 1 lakh at 30%. How much is it? 30,000. That means what is earnings after tax? 70,000. Okay. Now when the company has issued debentures, if the company has debentures means they will also have interest. Now calculate. 1 lakh is EBIT. How much debentures has the company issued for? 10 lakh. What percentage interest this debentures carries? 10%. 10 lakh at 10%, how much? 1 lakh. All right. Or maybe 10,000. I'll maybe make this as 1 lakh rupees. 1 lakh is the debenture value. Let's say 1 lakh at 10% is how much? 10,000. So that means interest is 10,000 if I assume. How much will be earnings before tax? 90,000. 90,000 ka 30%, how much is tax? 27,000. Now check what happened. If interest was not there, how much was tax? 30,000. Because of interest, you are paying how much tax? 27,000. Because of this interest, how much tax the company is able to save? 3,000. That means you touch your heart and tell, is the cost of the debenture really 10% or lower? Lower. Because of this interest, you are able to save some tax. All right. So this 10% is not your cost of debentures. We need to find it out. That is the essence of this topic. Okay, sir. That is what we have to find for each component. Can we dive in? All right. Now, first component is long-term debt. First is we are trying to find out the cost of long-term debt. So whenever long-term debt here refers to your bank loan debentures. Loan or debenture and all, we call it as debt over here. Okay. So whenever you have debt, no sir, whenever you have long-term debt, that debt you need to first check whether it is a redeemable debt or an irredeemable debt. Redeemable or irredeemable. Redeemable means what? At some point of time you need to repay. Like if I take a bank loan for 5 years, after 5 years, what I have to do? Repay the money. That means what is the term of this bank loan? 5 years. If the term is fixed means we call it as a redeemable. If that term is not fixed, if it goes on forever, then we call it as irredeemable. Okay, so whenever we have long-term debt, first find whether it is redeemable or irredeemable. For irredeemable debt, for irredeemable debentures, the cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. Interest into 1 minus tax rate divided by net proceeds. I've explained you the logic of all these formulas in regular class. Now we'll not have so much time. We will not be going into the explanation of the formula. We'll only be revising the formulas and solving the question. I hope this is okay with you. Alright. So what is the formula for irredeemable debt again? Interest into 1 minus tax rate divided by net proceeds. Or simple way, if I'll have to think about, means payment divided by receipt. Remember, you can remember it as payment divided by receipt. On bank loan, what will the company pay? Interest. On bank loan, the company will pay interest. All right. That means that is your numerator. That is your numerator. What is the denominator? By issuing bank loan or by taking bank loan, how much money company received? That will come in your denominator. Okay, people. So again, what is the formula again? Interest into 1 minus tax rate divided by net proceeds. I here stands for interest amount. Interest amount. T here stands for tax rate. Why do we do 1 minus tax rate? Because just now we saw on interest. Interest is an expense. Due to expense, profit will reduce. If profit reduces, means a tax also will reduce. On interest, you always get tax benefit. That's the reason numerator is not interest. It is interest into 1 minus tax rate. That is one. Okay, G. Divided by what, sir? Net proceeds. Divided by NP. NP stands for net proceeds. So for net proceeds, there are a few things you need to keep in mind. What is that? First, you need to check whether these are new debentures, whether it is a new debt or existing debt. Whether these are new or existing debt. If it is new debentures, if it is a new loan, first priority for net proceeds is always the issue price. It is always the issue price. Meaning by issuing the debentures, how much money the company will get. First, you will take that as a first priority. Okay, sir. If issue price is missing, then the next priority you will give it for market value. Even if market value is missing, then the last priority you give it for face value. This is the priority for what? New debt. Issue price, market value, and last priority, face value. Okay, G. However, if it is an existing debt, all right, if it is existing debt means, did you issue the debentures this year or many years back? Many years back. Are you finding out the cost many years back or today? Today. That means, will you take issue price? No. First priority in this case will be given to what? Market value. If market value is missing, next priority will be given for face value. This is the order. Okay, sir? Alright. Doesn't matter what number you take, one component compulsorily you need to reduce, that is flotation cost. Okay, so take this number and reduce what, sir? Flotation cost. That final number only we call it as net proceeds. So what is this flotation cost? Name itself is saying flotation cost. Flotation cost means to issue the instrument, are you incurring any cost? Like company will go door to door. Infosys will come to your place and sell debentures. Right? Now they will sell the debentures to the public using the help of a broker. Right? Underwriter we call it. Underwriter will do this activity at free of cost or charge some commission. So all that issue expenses, to issue the instrument, if you are incurring any expense, that we call it as flotation cost. That could be brokerage, underwriter's commission, or filing some documents with ROC and having some charges, whatever. All that we refer to as issue expense, which is denoted by the symbol in our FM terminology F. We call that as flotation cost. Easy, people? Okay, tell me the formula again. First of all, whenever, is it okay? I'll use this approach as much as possible. Let's try to remember everything in the class. I know that you remember this. Let's revise and try to recall it. Okay, so what are we trying to find here? Cost of long-term debt. Whenever we have long-term debt, first find whether they are redeemable or irredeemable. If it is irredeemable means, will it end or it will go on forever? It will go on forever. How do you get cost of irredeemable debt? Given by the formula, interest into 1 minus tax rate divided by net proceeds. Okay, for net proceeds, the first priority is, if it is a new debt, first priority for issue price. If IP is missing, then market value also missing, then face value. If it is existing debt, first priority to market value missing, face value. Okay, doesn't matter what you take, flotation cost should be compulsorily reduced. That way you will get net proceeds. Okay, sir, Can we come back to the other one? Okay, the next one is what, sir? Redeemable debt. Redeemable debt means, will it go on forever? No. At some point of time, you need to repay. Suppose I've issued the debenture for 7 years. I've issued the debenture for 7 years. That means, will it come forever or only 7 years? 7 years. That we call it as what, sir? Redeemable debt. And we call it as redeemable debt. For redeemable debt, the cost of debt is given by the formula. First part is same. What is that first part? Interest into, basically simple way to remember is payment divided by receipt. Payment divided by receipt. On debentures, what will the company pay? Interest. So that means the first part of the formula is, will you take interest or after tax interest? After tax. Given with the formula, interest into 1 minus tax rate. That is the first one. Okay. Plus what, sir? Plus RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. This one you already know. I for interest amount, T for tax rate, RV for redemption value, RV for redemption value, NP for net proceeds, N for remaining life, not total life, remaining life. Okay. Whole thing divided by RV plus NP divided by 2. Now, what is this funda is? Simple. So, suppose company issued the debentures for 100 rupees. Let's take it this way. Or 1 minute, I'll use this. Company issued the debentures for, or maybe it's okay. 1 second. Company issued the debentures for 100 rupees. Okay, that means these are net proceeds. But the company is redeeming the debentures for 120 rupees. What is the issue price? 100. But what is the redemption price? 120. That means is company paying the same amount or extra? Yes. Company issued the debentures for 100, but they are redeeming it at 120. So how much extra are they paying? 20 rupees. Yes, people. This extra means for the company it is a cost. What are we trying to find here? Cost. So that means, should we ignore this or consider this? Consider this. Okay, Saru. Now this is the cost. This is the cost for 1 year or for full year of debentures. Full year. Let's say debentures are issued for 10 years. Debentures are issued for 10 years. That means what is the cost every year? 2. That is the average cost per year. So that is what I expressed as formula. Get me this as formula now. What is this 120? What is this 120? RV, redemption value, which is RV. Minus what, sir? Minus net proceeds. What was net proceeds here? Net proceeds here was 100. Yes, no? Divided by N. N is what? Remaining life. That way you will get the average cost. Average extra cost you're paying. Okay, sir. This also cost. Hence, this also should be considered in your numerator. Got it? Alright. Now, this particular number, it's an actual number or average number? Average number, right? So, in the numerator, if you're taking average means denominator also you should take average. Otherwise, comparison will be wrong. Hence, in the denominator, we don't take net proceeds. We don't take net proceeds. What do we take rather? Average. Two things here we have, RV and NP. So, that means how do you find average of 2? RV plus NP divided by 2. Since here numerator had average, in the denominator also you should have average. That's your formula for redeemable debt. Got it, everybody? Okay, tell me once again, what is the formula? Don't look at the screen. Try to recall like that only. We are trying to find out cost of long-term debt of what? Irredeemable or redeemable? Redeemable. So, cost of debt is given by the formula interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. RV for redemption value, NP for net proceeds. That and all is the same. That's all is the cost of long-term debt. Okay, Saru? Alright. Sir, if you use online also till you're good? No problem? Though it's a marathon session, I'll go a little slow only. It's fine. Okay, now let's try to remember, because FM ultimately is a game of formulas and formats. If you know it, you'll get full marks. Otherwise, going. That way it is. It is a scoring topic provided you remember the formats and formula. Alright. Sir, these two methods, whatever we discussed, that we call it as approximation method. There is another method to find out the cost of debt. That we call it as IRR method or yield to maturity method. You can call it as IRR or you can also call it as yield to maturity method. Both are acceptable. Okay. So how is this? Very simple. IRR you already know. Alright. For IRR, simply we have to assume two rates. We are trying to find out cost. No, it works on trial and error basis. Two rates you take and find out the present value of it. How do you find present value? Simply take the future value and multiply by the discount factor. So, year column you have to take. I've assumed in my example the debenture is for 3 years. I've assumed it for 3 years. Okay. So, you will start in the year column. Year 0, 1, 2, 3. Then you will write the cash flows. All these are future cash flows. Then you will have to assume a discount factor. First, the cash flows. Simple. IRR means what is the rate at which present value of cash inflow will be equal to present value of cash outflow. A rate at which present value of cash inflow will be equal to present value of cash outflow. That rate we call it as IRR. Or in simple another terminology, let us say you invested 100 rupees. You gave 100 rupees to the banker today. You invested in fixed deposit in the bank. How much? Today. Banks gives you 10% interest rate. Banks give you 10% interest rate. At the end of 1 year, how much will be this this particular fixed deposit value? Will it be 100? No, it will not be 100. It will be what, sir? 100 plus 10%. It will become how much? 110. This is 110 is a value today or after 1 year? That means what is this? Future value. How much money you gave to the banker today? 100. This we call it as what? Present value. At what rate the present value of future cash flows and present value of cash inflow and present value of cash outflow will be same. That only we call it as what, sir? IRR. Okay. So here at 10%, if you want to find out the, what is this? What is this? Present value or future value? How do you find out the present value of this? Take 110 and multiply by the discount factor. How much is the discount factor here? 10%. Sir, what is the formula to get the discount factor? 1 divided by 1 plus I whole power n. So 110 into 1 divided by, what is the interest rate, sir? 10%. Whole power n is how much here? How many years did you invest the fixed deposit for? 1 year. Calculate this. 110 into 0.9090, you will get how much if you do it? Obviously, you will get how much? 199.99 something you may get. That is equal to what, sir? 100. That means what is this? What is this 10%? 10% is your IRR. That is all it is. Okay, sir. Comfortable, everybody? So means for me as an investor, it's a return. For me as an investor, this is a return. For a banker, it is a. For a bank is paying interest or bank is receiving interest or paying interest here. Paying. That means for a banker, this will be what? Cost. Is this okay with you, everybody? This is what we are trying to find out here. Okay, everybody? Cool. All right. Now in this particular problem, 10% return, I only gave it to you. Right? In the problem, it will not be given. This we have to find out. How does this IRR method work? Simply by assuming 2 discount factor. Your choice. Man marzi. You take 2%, 5%, 10%, whatever you want, you take the rate and try to find out IRR using approximation method. Easy, people. So how do you simply find out IRR? Take the future value and multiply by the discount factor. Discount factor will be given or we have to assume? We have to assume. So first rate, I've assumed the discount factor to be 10% over here. Okay. Just started. Just for the sake of format, I've brought in some numbers. Okay, Saru? Now we have to consider all the future cash flows. Simple. Go back to your approximation formula. There are 2 cash flows associated with debentures. Tell me what are those? 2 cash flows. Interest and net proceeds. Interest and net proceeds. So year 0 column, you will take net proceeds. Year 0 column, you will take net proceeds. It's very simple, funda people. All right. Now think from company perspective. Company has issued the debentures. When the company has issued the debentures, they will receive the money. Okay, that means that is an inflow. On this debenture, company has to pay interest. Interest is an outflow. That means you got your inflow and outflow. IRR means what? A rate at which the present value of cash inflow will be equal to present value of cash outflow. So inflow and outflows, you take it and multiply by the discount factor. Okay, first thing you will take is the net proceeds. Company, by issuing the debentures, will they get the money later on or today only? Today only. That today only we call it as year 0. Year 0 in FO means year 1 ka beginning. Year 1 ka beginning. In the year column, if I write 1, it means end of first year. When I write 2, it means end of second year. 3, when I write, it means end of year 3. When I write year 0, it means year 1 ka beginning. Okay. Now by issuing the debentures, company will receive money today or future? When they will receive? Today. So which column I should write the net proceeds? Year 0. So hence year 0 you will write the net proceeds. Okay, Saru? Alright. Then company has to go on paying interest. Interest is a one-time activity or all the years? How many years I've assumed here? 3 years. So all the 3 years take interest. But 1 second, hang on. Should I take interest or after tax interest? After tax interest. Hence I won't take I'll take interest into 1 minus tax rate. Okay, people? But third year, will there be only interest or company will have to repay the money? Repay the money. That means there will also be RV. RV as in redemption. These are all your cash flows. That's all it is. Okay, Saru? Multiply this by the discount factor. But one thing is IRR ka full form is implicit rate of return. Implicit rate of return. For a company, it is a return or a cost? Cost. For whom it is a return? Investor. That means you always put the signs, you always show the signs, positive or negative. You will put it not from the company viewpoint, you will put it from the investor viewpoint. Because IRR is a return. For whom it is a return? For a company or investor? Investor. That means you tell. Now, when the company issues debenture, investor will receive money or pay the money? Pay the money. That means this outflow, this net proceeds, you should show it as a positive number or negative number? Negative number. Because from investor perspective, it is an outflow. Got it? Now, interest. Company is paying interest, but investor is receiving interest. That means from investor perspective, interest is an outflow or inflow? Inflow. That means all this number, you will show it as a negative number or positive number? You will take interest into 1 minus tax rate as a positive number. Got it? Similarly, redemption value. Redemption value. Investor is paying the redemption value or getting the redemption value? Getting. That means outflow or inflow? Inflow. So all these are inflows. You will show it as a positive number. This one you will show it as a negative number. Plug in this number. This is your cash flows. Everybody cool? Okay. Now we are trying to find out what's our IRR. For that we have to assume two rates. First you will take discount factor at 10%. Okay. Take that and find out this. You will get no. Sir, if 10% is actual IRR means, 10% is actual IRR means, I already proved it to you here. If 10% is actual IRR means present value of cash inflow and present value of cash outflow should be different or same? Same. Sir, how do you get NPV? Net present value. All this you have studied. How do you get NPV? How do you get net assets? In accounts, may we calculate net assets? How do we? Name itself is saying net assets. How do you get? Assets minus liability. Assets minus liability. If you get, you'll get net assets. Same ground may calculate net present value for me. NPV. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Okay, sir. At IRR, present value of cash inflow and outflow will be different or same? Same. Sir, if inflow ka present value, outflow ka present value is same means NPV will be 0. Another way to put across is IRR is a rate at which NPV should become 0. Now I assumed a 10% discount factor. If my NPV becomes 0 means full happy. Why? Because my 10% itself is my IRR. But unfortunately, ICA doesn't like that approach. IRR usually will be in decimals. 10.23, 10.78. Will anybody assume 10.78 as a rate? No. That means you didn't get. Suppose at 10% I got NPV to be 500. Assumption. Now is this my IRR or no? No. One more rate you assume. Now I'm testing with the 15%. Instead of 10, now I'm testing at 15%. Same again, find out the present value of future cash flows. Assume that you got it to be 50 rupees. NPV became negative 50. Sir, that means is my 15% my IRR? No. If 15% was IRR means NPV should have not been 50. It should have been what? 0. Is it 0 or negative 50? Negative 50. That means can I say what? IRR is somewhere lying between 10% and 15%. That is what we need to find. So IRR is always found out by trial and error method assuming two rates. Assuming two rates. For the sake of example, I've taken here as 10 and 15. In exam, you don't have to take 10 and 15. Just for the sake of example, I've written. Okay, people. Now, did we get IRR or not yet? Not yet. Now, take this number and plug into your interpolation formula. IRR is given by formula. I told you the logic of that also. Alright, but ICA does not use logic method. They always use interpolation ka formula. We will follow the formula only in examination. So IRR, anybody remembers formula? What is IRR ka formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So take the data. In this table, maybe we worked out data now. Take this data and plug it into this particular formula and you will get your IRR. Okay, Saru. Now, just to be on the safer side, we'll write it over here. Sir, I've assumed what rate? 10 and 15. In 10 and 15, what is the lower rate? 10. That means IRR is given by the formula lower rate. If you want, once again, I'll write the formula. What is that? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Okay, I've assumed two rates, 10 and 15. In 10 and 15, what is the lower rate? 10. What at 10%, what is my NPV? At 10%, my NPV is 500. Divided by NPV at lower rate, 500 minus NPV at higher rate. Higher rate is 15%. At 15%, my NPV was how much? Negative. Sir, I have to reduce. Negative of negative will become positive. That means I have to do this. Whole thing multiplied by higher rate, which is 15 minus lower rate, which is 10. Do this, you'll get the formula. If you want, you can take this 10 in percentage, or if you want, you can take it in decimal. 10% instead of this, you can take it as 0.1. If you take 0.1, your answer also will be in decimal, where you have to convert it in percentage. If you take directly percentage, you will get answer also in percentage. This is how you find out IRR. Okay, Saru. Now the approach is very simple. I will do a few theory, 4-5 theory concepts. Then I'll take up a question. One question which targets everything. Okay, like that we will be solving. Till here, everybody cool? Morning, online also, early morning. All of you are woken up already? Appo, alive, not doing and all no? Pakka cool? You're able to recall the formulas? This is important. Formula is a must. Should and must in FM. Otherwise, you will not get marks. Yes, sir. Drinking coffee, sir. Early morning drinking coffee. Okay, just to keep yourself alive and awake. Okay, that's nice to know. So these are the two methods to find out the cost of a long-term debt. Cost of a long-term debt. Now we learn two formulas, two ways. One is approximation method. Another one is IRR method. Now the next question is which to use in exam. Sir, in examination, they will mention either you go for yield to maturity method. Yield to maturity method is also known as IRR. Either if they say IRR or yield to maturity method, use IRR only. If they say approximation, use approximation. If they don't mention, bumper offer for you. You do whatever you want. I suggest if there is a choice, always go for formula. Because formula is easy. It will be like you will get the answer fast. If there is a choice. Otherwise, compulsorily do what is being asked in the examination. This is one. Okay, Saru. That is your first component. Can I dive in further? Okay, so one we are done. What's the first thing we have done now here? Cost of debt we have found out. Debt here refers to both bank loan as well as debentures, but it should be long-term in nature. In fact, when we say cost of capital, it's always the cost of long-term finance, not the short-term finance we are talking about. Okay, sir. First part is done. Can I dive into the second one? Okay, second one we will take up is, or maybe there's one more. Maybe I'll take up that here. Okay. Next one is cost of convertible debentures. Cost of convertible debentures. Stop there, sir. Convertible debentures means, let's say the life of the debenture is 10 years. Life of the debenture is 10 years. After 10 years, company will repay the money back to the debenture holders in the form of cash? No. It will get converted into equity shares. Convertible debentures means at some point of time it will get converted into equity shares. Now, company is so Dharala Prabhu Karna. Company is telling the debenture holders, hey macha, you take cash. You take cash as the redemption value, or you take equity shares, or you take equity shares. Your choice, da. Your choice, macha. That's what the choice company is giving to the investor. In this case, how to find out cost of long-term debt? That means, is there one redemption value or investor ka choice? Investor choice. There are two redemption values here. What are those? Tell me. Investor can either go for cash option, or he can go for equity option. You will have to find both. What is the redemption value at cash option? What is the redemption option at equity option? Now you tell me, if you are an investor, if I tell you I'll give you 100 rupees, I will give you 200 rupees. Which one will you choose? Obviously, you will go for the lower one or higher one. So find out the redemption value of both and choose what, sir? The higher of the two as the RV. And then you do the remaining same. That's the only different step. Okay, sir? Everybody cool? Okay. Now let me see how well you have understood. Suppose company says it's a compulsorily convertible debenture. It's a compulsorily convertible debentures. Now what you will do, tell me. Now we have two options for convertible debentures. First we find redemption value at cash option. Redemption value at share option. Take the lower of the two or higher of the two. Higher. That's a normal way. But if it is compulsorily convertible debentures, should we find out both or one is good enough? One is good enough. Which is that one? Redemption only at equity value. Why? Because are we giving cash option to investor or no cash option? If there is no cash option but only shares option, we will only take the share ka redemption value as the redemption value. Like that also question can be framed. It has been asked in one of the problem as well, which we will do it. Yes, people, this is all a drama about the cost of long-term debt. Next, the second one. Okay, second one is the cost of preference shares. Sir, cost of preference shares is denoted by the symbol KP. Debentures ka cost is denoted by the symbol KD, not Kannada KD. Okay, KD here stands for cost of debt. KP is denoted by cost of preference shares. Sir, you know the formula. You are amazing. Tell me the formula. Again, when there is a preference shares, you need to find out whether it is a redeemable or irredeemable preference shares. If it is irredeemable preference shares, for irredeemable debt, what is the formula? Simple formula, payment divided by receipt. What is the payment? Interest into 1 minus tax rate divided by net proceeds. Okay. Now here substitute. On preference shares, will you get interest or preference dividend? The payment which the company will make on preference shares is preference dividend. Hence the formula will be what? You will do preference dividend into 1 minus tax rate? No. Sir, dividend will come after paying tax. Dividend will come only after paying tax. So on a dividend, whether it is equity dividend or preference dividend, will you get tax benefit or no tax benefit? No tax benefit. That means should we do preference dividend into 1 minus tax rate? No. We'll take what is the numerator? Preference dividend divided by net proceeds. That you can call it as P0 or whatever. It's okay. Fine, people. So basically preference dividend divided by net proceeds. So what is net proceeds ka value? Again, what is that? First, we need to check whether these are new preference shares or existing preference shares. If it is a new preference shares, first priority to issue price. IP missing, market value. Market value also missing. Last priority to face value. If it is existing preference shares means first priority, market value. Market value missing, face value. Doesn't matter what you take, flotation cost compulsorily you need to reduce. That formula is the same. Done, people? This is for irredeemable preference shares. You also have one more called what? Redeemable preference shares. Tell me if it is redeemable preference shares, what is the formula? Preference dividend. That's all, or one more cost is there. One more cost. What is that denoted by? Plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. RV for redemption value. NP for net proceeds. N for remaining, not total life. N for remaining life. Okay. Whole thing divided by RV plus NP divided by 2. This is the formula. Tell me, is this a new thing or same drama? Same drama. Sir, these two are again known as what, sir? Approximation method. You can find out cost of preference shares using approximation, that is formula method, or you can go for IRR. Tell me if it is IRR method, tell me the format, what you will do? Tell me in format. First format will be year, then cash flows, then discount factor. Discount factor will be given or we are trying to find? We're trying to find. That only we call it as IRR. Tell me in year column, what will you start with? 0. If the preference shares is for 5 years, then in the year column, what and all you'll write? Year column A, you'll write year 0. Is it okay if I just tell? Okay. Year column A, you'll write 0. Then 1, 2, 3, 4, 5. Year 0 column A, what we'll write? Basically, IRR is a rate at which present value of cash inflow and present value of cash outflow are same. At year 0 May, what you'll write? Net proceeds. You'll write net proceeds. Then year 1, 2, 3, 4, 5 column May, will you write interest or preference dividend? You'll take preference dividend. 5th year May, only preference dividend will be there or even RV will be there. RV will be there. But when you're putting the signs, when you're showing positive and negative number, you will put it from the company perspective or investor perspective. Because IRR is a return. For a company, it's a return or a cost. Cost. That means the signs, positive, negative, you will always put it from the investor perspective. So if at year 0, net proceeds, you will show it as negative. Preference dividend and redemption value, you will show it as positive number. Accordingly, find out present value. Okay, sir. If the rate you have assumed, is proper, means NPV should become 0. So much lucky you will not be there. If by chance you get so much lucky, don't freak out. Say thank you Allah, Jesus, Shiva, whatever, and move on. Okay, now you will not be mostly, but sometimes institute can give a bouncer. 10% only they can make it as IRR. You also assumed how much? 10%. Shock. 10% is IRR. Look at your lucky stars. So 10% was actually IRR. Doesn't happen, very, very rare, but if it happens, thank everybody whom you know and move on to the next question. Okay, then take two discount factor, then you will get IRR or you will have to plug in that number in the formula. What is that formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Accordingly, you will get IRR ka cost of preference shares. Easy, people. Okay, and that's all is with respect to preference shares. 2 tomorrow. Third one will go. What is the third one? Cost of equity shares. Sir, equity shares now are crazy people like me. Okay, because equity shareholders ka expectation will be same or different. Sir, here no, sir, in this chapter, in fact, I've written it also. Here, cost refers to the return expected by the providers of finance. Whatever return the providers of finance are expecting, that only we call it as what term? Cost of capital. Okay, sir. How much ever return, not what you're paying, how much the investor are expecting. That expected return only we call it as cost of capital. Now, equity shareholders ka expectation will be same or it will go on changing. Now, as we are speaking, now they're talking about the recession and all. Because of all that, Trump is playing that tariff cardo. All right, China is also playing that dishum cardo. Yes, no. Because of that, the stock market is drastically falling. If you observe, yes or no. People are talking we'll go into recession and all. Now it's a recession environment. Now you are an equity investor. What is your expectation? Daivame, give me 5% also. Good enough. I'm happy with the 5% also. Don't give me negative return. Give me 2% return also you do. I will take it with big smile. Because it's a recession environment. Now it's a boom environment. It's a boom, boom. Everything is going up. Now you will expect 2%? No, now the shareholder will say, I want 200% return. Possible, huh? I mean, the shareholders ka, equity shareholder ka expectation same or changing? Changing. Hence, for equity shareholders, we have multiple methods. Since the expectations are multiple, we have multiple methods to find out cost of equity shares. One among them is popular in examination, 1 or 2, but others are just for the namesake, but good to know, it can come as an MCQ question. Okay, sir. First one is dividend price approach. Dividend price approach. Sir, in the name only there is formula. Dividend price approach. Or simple, cost is given by what formula? You tell me, you know how to remember it. Payment divided by receipt. The method name is dividend approach. Okay, in dividend price approach, what is the payment? Dividend. Okay, divided by net proceeds. That we call it as P0. This will be easily, I mean, for existing one, we'll find out. So basically, the dividend divided by the price, if you do, automatically you will get the cost of equity under dividend price approach. Easy, people. Under this dividend price approach, the assumption is the dividend will be constant throughout. Meaning, if company gives you 10% dividend in the current year, next year they will change it or same. Every year ka dividend is assumed to be constant in this particular method. That's the rational or assumption of this particular method. Okay, ji. All right. Next one is earnings price approach. Earnings approach. Tell me the formula again. Don't look at the chart book. By the way, this is known as chart book. Okay, and talk about that later. Earnings approach. What we will take? Name it. In dividend price approach, the formula was dividend divided by price. In earnings, it will be earnings divided by price. So basically, EPS divided by NPS. Okay, that current market price only is denoted by the symbol P0. P0 means current. Sir, in FM terminology, whenever zero comes, zero means now. Zero means now. Okay, so P0 means current market price. P1 means price of the share at the end of first year. P2 means price of the share expected at the end of second year, like that. So basically, you do EPS divided by P0 or current market price. You will get the cost of equity under this method. Easy, sir. Now, another person came called Gordon's growth model. They told, what foolish. Gordon sir is saying, what foolish. Sir, can dividend be constant ever or dividend will go on changing? Changing. That means dividend, if I give you 10%, if I give you 10 rupees salary today, tomorrow you will expect 10 rupees only or more. That means your expectation will be same or it will keep on growing. So, Gordon sir introduced something called G. G here stands for growth rate. So, according to Gordon sirs, the dividend will not be constant. It will go on growing. Hence, go again, just take this particular formula and refine it. So, in dividend price approach, what was the formula? Dividend. Okay, dividend. In this method, dividend was assumed to be constant. Can dividend be constant? No. So, first you will take it as D0. D0 means what, sir? Dividend already paid. Current year ka dividend already paid, we call it as D0. Will it be same now or it will increase? So hence you do 1 plus growth rate. Take the D0 into 1 plus growth rate. Or in simple terminology, okay, let's say I have paid a dividend of 10 rupees now already. I have paid a dividend means what is this? D0. Let's say growth rate is 10% or growth rate I'll make it as 15%. Growth rate is 15%. Tell me, sir, now if I have paid you dividend of 10 rupees means at the end of current year, will you expect the same dividend or you'll expect more dividend? More. How much more dividend you'll expect? 15%. That means what will be the expected dividend at the end of year 1? Will it be 10? No, it will be 10 plus 15%, which will be how much? 11.5. Correct? This is how you get it. This you can get it through one more formula. How do you use that? Simply you do D0 into 1 plus growth rate. What is the D0? 10 into 1 plus growth rate is how much? 15%. If you do this, automatically you'll get how much? 11.5. Another way to get it. Yes, people? Okay, everybody? So, the formula is D0 into 1 plus growth rate. Divided by what? Here, what was the formula? P0. So, you take P0. But to issue the instrument, you might also have some flotation cost. If there is any flotation cost, reduce that. Reduce that flotation cost. This is your payment divided by receipt. Payment divided by receipt. Got it? But will the dividend grow only once or forever? Forever. For how many years? We know, or infinity? Infinity. To capture that, we add again the growth rate at the end. So that is the formula as per the Gordon's growth model. Tell me the formula once again. What is that? D0 into 1 plus growth rate divided by P0 minus flotation cost. Whole thing added by the growth rate. If you do D0 into 1 plus growth rate, automatically what you will get? D1. So if they have given directly D1 in the problem, you can substitute this formula. D1 divided by P0 minus flotation cost plus the growth rate. Check the problem whether they have given D0 or D1 and accordingly substitute and get the answer. Yes, people. This is your garden, sir. Come on. Okay, Ji. Sir, what about this growth rate, sir? How to find out this growth rate? Sir, in our regular class, our favorite method was trial and error method. We used the trial and error method to get a growth rate. There are multiple ways to get growth rate. One is through trial and error method. Just like for IRR method, we assume some rate. Like that, you can use some trial and error method and get growth rate. That is one way. Or you can get growth rate using future value table or through future value table. I'll tell you how through one problem. Or growth rate is given by the formula B multiplied by R. B for retention ratio. R for rate of return on investment. Okay, what is the retention ratio? It's simple. Suppose company has earned, maybe I'll use this. Suppose company has earned an EPS of 10 rupees. EPS means earnings per share. How much has the company earned? 10 rupees. Sir, if the company has earned 10 rupees means, should they distribute entire 10 rupees as equity dividend or company ka choice? Company ka choice. Company is saying only 40% I will distribute. Only 40% we will distribute. That means how much is dividend? Though they have earned 10, are they distributing 100% or 40%? That means what is dividend, sir? 4 rupees. Yes. Sir, how much they earned? 10. But how much is being paid out as dividend? 4. That means is there anything retained by the company? Yes. Out of 10, only 4 was distributed. Means how much was retained? Retained is 10 minus 4, which is 6 rupees. Okay. Sir, can you tell me the 6 in percentage? Sir, out of 10, you have retained 6 means how much is the retention percentage? 16. Like your GP percentage. GP upon sales into 100. So here 6 divided by 10 into 100 if you do, how much are you going to get? 60%. This only is denoted by the symbol B. B here stands for retention ratio. Okay, so take the retention ratio and multiply it by R. R for rate of return on investment. So you do G, I proved all this in my regular class. Now I'll not go into all that. G is given by the formula B multiplied by R. Do that, you will get the growth rate. There are 3 ways to get it. Depending on the information, we'll go on using it. All this will come in formula or in the question later on, but I want you to be aware of it so that once again I will tell, so it becomes a second revision for you there. Till here, any questions for me so far? Online also cool, offline also cool. Sir, when will you give Sapadu break, sir? That is the only doubt, sir. Sir, that doubt, no, I'll tell you, sort it out here. Once this topic is over. Once this topic is over, Sapad will go into our tummy. Till then, you also have to be hungry. I'll also be hungry. Don't be angry, just be hungry. Okay, Saru? Like that. We will finish a particular topic because in between, if I stop, no, then we'll not get the Josh. Okay, so we'll finish, we'll take a break, then take up the next topic and like that. Topic after topic, we will get a break. Okay, moving along. Online. Cool. Quickly, tell pa. Okay, next one is something called CAPM model. CAPM stands for Capital Asset Pricing Model. Capital Asset Pricing Model. In Capital Asset Pricing Model, cost of equity is given by the formula RF plus beta into RM minus RF. Cost of equity is given by the formula RF plus beta into RM minus RF. RF here stands for risk-free return. Risk. RF stands for risk-free rate of return. B here stands for beta. RM is your market rate. RF is your risk-free rate of return. So RM minus RF, if you do, you call it as risk premium. Sometimes they'll directly, instead of giving you RM minus RF, directly they'll give you risk premium also in the question based on the information used. What is this? Very simple. Let's look at this. Suppose I'm an investor. I have 10 lakh rupees. 10 laksha irukku engita. Okay, I have 10 lakh rupees. I want to invest. Okay. Now, sir, I can invest in RBI ka government bond. RBI has issued some bond. On that bond, how much interest are they paying? 7%. They will pay 7% interest every year is what they're telling. But I am hungry, angry, or I'm whatever. I'm not ready to settle for 7%. I want more. All right. Now, cost of equity is given by the formula. Tell me once again, what is the formula? RF. RF means risk-free rate of return. Sir, if government has issued any instrument, means can the government tell my instrument will carry risk? No. Whatever government has issued, all that we call it as that is a risk-free instrument. So whatever interest rate you are getting on your central government bonds, state government bonds, RBI and all, we call it as risk-free return. So here in this example, how much is the risk-free rate of return? 7%. Okay, sir. So that is your first formula. first component, plus beta into RM minus RF. Now, sir, I have another option. Instead of investing in RBI bond, I can invest in stock market. Stock market, no, my BSC, Bombay Stock Exchange or National Stock Exchange, gives an average return of 15%. Okay, sir. Now, check. Compare it to RBI bond, market is giving how much extra? Compared to RBI bond, market is giving you how much extra? Market is giving you 15, government is giving you 7. So, how much extra is the market giving you? 8% return you're getting extra if you invest in the market, correct? I am still want more. I'm still hungry for more. So I did not buy Sensex. I did not buy Nifty. I invested in Infosys ka share. So did I invest in market? Market means you can buy Nifty ka index and all you can buy. Do you know this? There is an index fund. Index fund means top 50 companies of the India is there. No, that we call it as NST ka Nifty fund. BSC will have top 30 ka funds. Okay. So I did not invest in that fund. I bought what? Infosys ka shares. Infosys ka beta is how much? 2, I've assumed. Infosys ka beta is 2%, I've assumed. What it means is, if beta is 2, what is the indication is, if market gives you 1% interest rate, if market gives you 1% return, my company ka beta is how much? 2. My company will give twice. My company will give 2 times more. If market gives 1% return means my company will give 2 times of that. So 1 into 2 is how much? 2%. Like that. If market reduces by 5% means? If market reduces by 5% means my company ka share price also will reduce. Same or twice? Twice. My company ka share price will reduce by 10%. 5 ka 2 which is 10%. So beta is a relationship between the market ka performance and company ka performance. Market ka and company ka performance only is measured by beta. Okay, sir? Alright, now here check everybody. How much is market giving the return? 15%. Government is how much giving how much return? 7%. That means compared to the government, market is giving how much return? 8%. Market is giving 8%. Am I investing in market or company? And my company ka beta is how much? 2. Sir, if market gives 8% means my company will give twice of that because my beta is 2. So 8 into 2 is how much? 16. 8 into 2 is 16. That means by taking risk, how much extra I am earning? 16. Without taking risk, how much anyway I will get? 7%. That means totally how much return am I expecting? 23%. That is only expressed as formula. That's the logic of that formula. But we don't want logic, we only want magic. What that magic is formula. What is formula? Cost of equity is given by the formula RF plus beta into RM minus RF. That's all. This RM minus RF sometimes is referred to as, sometimes it is referred to as risk premium. Instead of giving you this 15% and 7%, sometimes directly they can give you 8%. Meaning risk premium is 8%. Like that they can tell. Risk premium means by taking risk, how much extra return are you getting? That's all it is. This is CAPM model ka cost of equity. Can I move forward, people? Okay, this is also over. Next one is, one more formula was there which we already did. What are those? Yield to maturity method or IRR method. You can use yield to maturity method or IRR method also to find out cost of equity. But here you need to be a little careful. What is that? Sir, first check in the problem whether have they give you year-wise return. Have they given you year-wise return? Meaning every year ka how much dividend, how much is the price they would give you. If that data is given or not, first you need to check. If that data is given, we'll have to use geometric mean ka formula, which we have done this. Or you can go for your normal IRR ka method ka formula. I'll apply this in immediately 2 questions. Okay, Saru? So what is it? First you will check what? Under IRR method or yield to maturity method, first you will check whether year-wise return given or missing. If year-wise return is given means you will go for this particular formula. If year-wise return, if it is not given means you will go for IRR ka formula. Okay. All right. I see some of you are still writing. In case you want to buy this chart book, it's available in our website. Soft copy online, people don't ask me. I know in all our marathon session we do, there will be at least 8 to 10 comments. Sir, book kodi. All right. Sir, book ka soft copy will not be available. Okay. If you want to buy hard copy, you can visit our website, ArivuPro.com. Under that, there is a book section. You can buy that. If time permits, later on, I will also show you where to buy it. Okay. I don't know if now internet is connected or not. Later, I'll show you. For now, anyway, we are in the zone. Marketing we'll do later. Yes, no. First, we want our exams. Yes, no. So far, okay, sir. All right. Now, how this particular things work? Let's apply it in one question. 1 minute. I'll take you through. Here, check this. Mr. Mehra had purchased shares of Alpha for how much? 1000 rupees. Okay, sir, 1 second, hang on. Now you are putting all the signs from what, sir? If you are doing IRR method, you will put positive, negative sign from the company perspective or investor perspective. Investor perspective. Always keep this in mind. Okay. So who's the investor here? Mehra. He purchased the shares by paying how much? 1000 rupees. That means from the Mehra's perspective, this 1000 is inflow or outflow? There's an outflow. Okay, sir. All right. He received a dividend for a period of 5 years at what rate? 10%. Good. Okay. So every year, how much dividend is he receiving? 10%. So how much did he invest? 1000. 1000 rupees he invested. Okay. And he's getting a dividend of what rate? 10%. That means the dividend amount is how much? 100 rupees is the dividend amount Mr. Mehra will get for 5 years. Okay, ji? Alright. Sir, dividend is calculated on face value, no, sir? Have they given face value? No. Then I'm assuming that this 1000 rupees itself is face value. Okay, possible, because you can issue the shares at face value also. Correct? Okay. At the end of 5th year, he sold the shares of Alpha for how much? 1128. Sir, if the investor sells it for 1128, means this 1128 is an outflow or inflow? This 1128 becomes your inflow. Okay, Saru? Alright. You are required to compute. Underline the word you. Okay. You are required to compute cost of equity as per what? Realized yield approach. That is also known as YTM method, or you can also call it as IRR method. Stop, sir. Sir, for how many years Mr. Mehra held the share? 5 years. 5 years ka is the price. Every year ka price of the share given or missing? Missing. Okay. That means in this case, you will follow normal IRR method. You'll go for normal IRR method. Normal IRR, you already know. What is that IRR method ka? Format, you tell me. Year, cash flows, discount factor, then cash flow multiplied by the discount factor. If you do, means you will get the present value of cash flows. Okay. We'll have to assume one discount factor here or two rates. In IRR, normally you will be required to assume two rates and plug that number in the interpolation ka formula. Can we quickly apply? Okay. Now here I have solved it. No need to solve it. Okay. Here check. We are trying to find out the IRR using, or you are trying to find out the cost of equity using IRR. First, the year column. Year column, you will always start with year 0. Year 0. Now, year 0 is what, sir? Tell me again, what is that year 0? Net proceeds. Okay. Now, Mr. Mehra purchased the shares by paying how much rupees? 1000. This 1000 rupees for Mehra is an inflow or outflow? Outflow. I mean, this 1000 I should show it as a positive number here or negative number? This 1000 will have to show it as a negative. That's one we have taken. Yes, people? Okay. Then, is there any inflow for Mehra? Yes. Every year, how much dividend he will get? He will get a dividend of 100 rupees. How 100? He invested 1000 rupees and he's getting a dividend of how much rate? 10%. So, 1000 ka 10% is how much? 100 rupees. So, every year, he's getting a dividend of 100 rupees. That's what I've taken here. For 5 years, this is a dividend amount. Correct? This is an outflow or inflow? Inflow. That means it's denoted as a positive number. At the end of 5th year, what did Mehra do? He sold the shares. He sold the shares for how much value? 1128. That means this 1128 is an outflow or inflow? Inflow. So hence this is an outflow. These are all inflows. So these are all present value terms or future value terms? Future value terms. Hence to get them on present value, what do? Multiply by the discount factor. Discount factor given or missing? Missing. So we'll have to assume. So I normally like to start with the 10%. So at 10%, let's find out. Okay. So how do you get discount factor again, sir? What is the formula to get the discount factor? 1 divided by 1 plus I whole power n. Okay. I here stands for interest rate. What is the interest rate? 10%. So calculate the formula. How much is it? For first year, what is the discount factor? Simply, how do you calculate that? 1 divided by 1.1. You simply do 1 divided by 1.1. If you do 1 divided by 1.1, for first year, you will get 0.9090. Then go on pressing equals to button in your calculator. 1 divided by 1.1 and then go on pressing equals to button. Sir, if equals to button, if it is not working in your calculator, throw that and get a new one. This is an important function. There is another way, I think MRC and all you can do and get it, but that's a waste of time. Always buy a calculator where you do 1 divided by 1.1 and go on pressing equals to number button. It should populate this value. If it is not, don't use that calculator. It's a waste of time. You'll be wasting. Time is a biggest factor in exam. Okay. Never, ever compromise on your time, especially for professional examination. Money can go. This is one approach, or maybe I'll talk about this. I'll finish this problem. Otherwise, somewhere else the discussion will go. First, we'll finish this. Okay, Saru. So 1 divided by 1.1. How much is it? 0.9090. Go on pressing equals to button. You'll get this. Yes, people. Done, done, done. For last year, the investor will get dividend also. He will get redemption value. Here, redemption value is nothing but sale value. That you will get. Both are positive number. Okay, Saru. Now, if you just check this number, is it changing or same every year? This particular dividend for 5 years, it is same. That means mathematically, sir, should you have to multiply this 5 times? No, when one number is constant, no, instead of calculating it 5 times, add all the discount factor. Only the discount factor you add. If you add all the discount factor, what are you going to get? 3.79. This number we call it as PVAF. This we call it as present value annuity factor. If cash flow is same every year, then instead of using each year ka discount factor, you can combine. And that combined number only, what do we call it as? PVAF. If you take each year ka discount factor, if you take, we call it as PVIF. PVIF for present value interest factor. Now dividend is same, no? Should we have to calculate 5 times and waste the time or shortcut method? Since that's I've written here, in the year column I've written 1 to 5. 1 to 5 means for all the 5 years, how much dividend am I getting? 5. Will we use here PVIF or PVAF? PVAF. How do you get PVAF? How much? You will get dividend for how many years? 5 years. So take your calculator, 1 divided by 1.1 you do, press equals to button 5 times. 1 divided by 1.1, 1 divided by 1.1 equals to button, you go on pressing, mine is not working, so it's okay, you tell. 5 times you press equals to button, then there will be a button called GT button. In your calculator, there will be GT, grand total button. Press that. When you press it, automatically you should be getting 3.7. Okay, sir. If that is not working, if that GT button is not there, throw it. Buy a new one. Okay. Go to the stationery shop, check. You tell the stationery vendor, hey, macha, give me calculator. Test to. Only that button is there. If it is working, then only take, because this particular way calculation is helpful for our accounts also. It is helpful for our FM also. So buy one which helps. Done, people? Okay, that is your PVA. Now you will only get the dividend or you will also get redemption value. Redemption value. Here in case of equity shares, will there be a redemption value or selling price? Selling price. Okay, so selling price 1128. When did the Mehra sell? First year or last year? When is that last year? 5th year. So this 1128 Mehra will get every year, investor will get every year or only once? Only once. That means for this 1128, should we take PVAF or PVIF only? PVIF. That too what? At 10%, what is PVIF for 5th year? 1 divided by 1.1 you do and press equals to button 5 times. When you do, the number you will get is 0.620. So if you don't like the shortcut method, you can go for a normal way also. But I suggest for exam, use this because it will save you some time. Done. So these are all what, sir? These are all what? Cash flows. Sir, at year 0, the discount factor is always 1. At year 0, the discount factor is always 1. Simple. You purchased Infosys ka share by paying 1000. You purchased Infosys ka share by paying 1000. What is the present value? Present value means what? The value today. How much did you pay to buy Infosys ka share? 1000. I mean, this 1000 rupees is on future value terms or already on present value? Already on present value. That means, should we have to find out the present value of this 1000 or already there? Hence, for year 0, the discount factor is always 1. Okay. So multiply these two, you will get the present value. 1000 ka 1 if you do, you will get 1000. These two ka multiplication if you do, you will get 379. These two ka multiplication if you do, you will get 700. From the investor perspective, this is what? This is what? From investor perspective, this is present value of cash inflow. This 1000 rupees is present value of cash outflow. Stop. IRR is a rate at which present value of cash inflow and present value of cash outflow should be same. Sir, if it is same, means NPV will be a positive, negative number or exactly 0? When you do this plus minus, are you getting 0? No. You got 79.37. That means I've assumed 10%. Is 10% my IRR or no? 10% is not my IRR. Can I stop there or assume one more rate? Assume one more rate. I like to keep a difference of 4 to 5% between two rates. If I've taken 10 here, means the next rate will be 14, 15 or whatever. Sir, if I instead here I've taken 14. Sir, I want to take 16%, sir. Will my answer be same? No. Based on the rates you assume, the final answer will change. In examination, usually rates, they will only give it to you in the question. If they don't give, you can assume any two rates, it is fine. Done, people? And now I'm testing it at 14%. Okay. At 14%, should I have to tell you the discount factor calculation once again or comfortable? For year 0, the discount factor is always 1. Dividend you're getting once or for 5 years? If you're getting for 5 years, we have to use for all the 5 years or shortcut method. What is that shortcut? PVAF. Okay, now you find out PVAF at 14%. How will you find? 1 divided by 1.14. Press equals to button 5 times. Stop or press GT button also. After that, also press GT button. You should be getting 3.14. 43. Now this is your cash flow. This is your discount factor. Multiply, you'll get present value of cash this much. Okay. Similarly, this 1128 you'll get every year or only once. That means at 14% for 5th year, you have to find PVIF. You'll get 0.518. This is your cash flow. This is your discount factor. Multiply, you'll get the present value. Okay, G. Now I added all this. When we add all this, are we getting positive number or negative number? What? Sir, if IRR was 14%, means should this be a negative number or it should be exactly 0? It should be 0. Is it 0 or not 0? That means IRR is somewhere lying between 10% and 14%. Now use this data and plug it in the interpolation ka formula. What is our formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Okay, sir, I will not have time to solve the question. I have the time only to revise the question. That's the reason I've already solved and brought it to you. We can only quickly go through. I hope this approach is okay for everybody. Okay, now you tell me the value. I've assumed two rates, 10 and 14. Which is the lower rate among this? 10. So that means the lower rate here will be 10. Sir, you can take the number instead of 0.1, you can directly take 10. If you take 10, your final answer also will be in percentage. If you take decimal, then all the numbers you have to take in decimal and final answer also will be in decimal, and later you have to convert it into percentage by multiplying by 100. Your choice, the way you want to do it. But for one I will take percentage, for another one I will take decimal. Don't do that. Either all the numbers should be in decimal or all the number has to be in percentage. Your choice. Only one basis. Okay. Lower rate is 10%. 10% in full number will be 0.1. At 10%, what is my NPV? 79.37 divided by NPV at lower rate minus NPV at higher rate. Higher rate ka NPV is already negative. I have to reduce it, and higher rate ka NPV is already negative. Negative of negative will become what, sir? Positive. Into higher rate minus lower rate. Higher rate is 14%, lower rate is 10%. Plug this number, you'll automatically get 0.120. When you convert it into percentage by multiplying by 100, you'll get 12.10%. This is your IRR ka calculation. I hope now this is little better on IRR. Yes. Completely okay. All right. This is your way of calculating IRR when year-wise return is not given. When year-wise return is not given. So to calculate year-wise return, we need price of every year. Here, how many years Mr. Mehra was holding the share? 5 years. That means if every year ka price if they had given means there is another way to calculate. Here, every year ka price was given or only once? They gave the selling price only at the end of 5th year. That's the reason we use normal IRR method. If by chance, if they give you every year ka price and every year ka dividend, then we'll have to use another method. That is what I've called it in the formula here. Just check this. If every year ka price, one second, if year-wise return if it is given, meaning if every year ka dividend and price if it is given means, you'll have to find out every year ka return. Okay, so first year ka return is denoted by the symbol 1 plus y1. This is just a denotion. First year ka return is denoted by the symbol 1 plus y1. You need to remember this. So first year ka for an investor, what is the return, sir? For an equity investor, what is the return? Dividend and also the price, because when he sells the share, he will get money, right? That means the numerator will be what? Dividend. Okay, we are calculating first year ka return. For first year return, we'll take first year ka dividend plus first year ka price. Okay, divided by P0, because investor would have purchased the share at year beginning. Hence, first year ka return is given by the formula D1 plus P1 divided by P0. Okay, on the same ground, if they give you 4 years ka return, calculate what is second year ka return for me. Second year ka return D2 plus P2 divided by P1. Okay. Third year ka return D3 plus P3 divided by P0. Fourth year ka return D4 plus P4 divided by P3. Sir, why only 4? I have just given problem specific pointer. In the problem that we are about to solve now, only 4 years ka return they had given. They may also give you 6 years also, 10 years also. But usually for these sort of problem, I say will not change. Okay. So first find if they give you 4 years ka data means you will find 4 years ka return. Only 4 years or based on the information? Based on the information. In the question we are about to solve now, they have only given 4 years data. Hence we can find out the return only for 4 years, which I have found out here. Okay, people. Then cost of equity is given by geometric mean ka formula. If you remember in mathematics, we used to do something called arithmetic mean, geometric mean. There was also one more, I have forgotten now, the whatever. Yes. Harmonic mean. Yeah, harmony. Pity. Done. So this cost of equity is given by the formula. You have 4 years return, no, sir. You have 4 years ka return. Multiply all the 4 years ka return and find out the square root of that. Find out the square, not the square root. How many years return you are able to find out? 4. That means you need to find out 4th root. You need to find out 4th root. If they give you 6 years ka return, then you will take 6 root. Usually they will not give. They will give either they will give you 2 years return or they will give you 4 years return. And minus 1 you do, you will automatically get. There's a way to calculate geometric mean. Sir, this particular question has not come since many attempts. ICI has a trend. Something which has not come since many attempts, suddenly they will take it and put it off. When it will come, I also don't know. Okay. So better to know all this because many students would have skipped all this. Because when they look at the study material, they'll be like, this, that, they'll leave it off. Okay, but easy only. So if you do it, extra 4-5 marks, swaha for you. Easy, no? Okay, tell me once again, what is that? What is this way? Plain application of this in the next question. We will go for this also IRR, yield to maturity method only. But you will do this method when year-wise return is given. So if they give you 4 years data, you will calculate return for how many years? 4 years. First year return is denoted by the symbol 1 plus y1. 1 plus y1, how do you get, sir? D1 plus P1 divided by P. Second year ka D2 plus P2 divided by P1. Third year ka D3 plus P3 divided by P0. Fourth year ka D4 plus P4 divided by P3. Denominator is always one number lower. That's all. Okay, sir. And all the returns you multiply and find out the square root. Okay. How many years ka square root you have to do? Since they have given 4 years ka data, you will have to find out the 4th root and then minus 1. That's all. Okay, sir. Can we apply this in one question now quickly? If you got it, I think I would be happy if you say don't skip the question, sir. You didn't say only. Maybe. Then we will do it. No issues. Sir, we have paid full fees, sir. You explain, sir. It's okay. Alright. Hey, marathon, no fees, no da? Yeah. Okay. Calculate the cost of equity using the following data. Using what approach? Realized yield approach. Stop there only. They have given you year, they have given you dividend, and they have given you price. Sir, in the last problem, year-wise dividend, was it available? Yes. Last problem, Mehra wala problem. Dividend every year, was it available? Yes. Hey, what did he received a dividend of 10% for 5 years. Every year dividend available. But price for every year available or not available? Not available. Okay, that's the reason we use normal IRR method. Here, every year ka dividend information available. Every year ka price information also available. That means you will go for that return wala formula. Okay. Now check. Be careful. They have given how many years ka data? 5. That means 5 years will find, sir. Samadhana Guru. Check. Dividend per share. Okay. Sir, this is first year ka dividend denoted by the symbol what? D1. This is second year ka. This is third year ka. This is fourth year and fifth year. Okay. So you got D1 to D5. No issues. Check this. Price of the share. Price of the share. But this price is at the year beginning. Sir, first year ka beginning only in FM terminology, what do we call it as? First year ka beginning price, we call it as P1 or P0. That means this data, what they've given is for P0. Understood, everybody? This is the price of the share at the end of second year or second year ka beginning. This 9.75 is the price of the share at the second year ka beginning. Second year beginning. Sir, first year ka closing price becomes next year ka opening price. I mean, this is the price of the share at the beginning of first year. This is P1, or rather this is the price of the share at the end of first year. This is the price of the share at the end of second year. This is the price of the share at the end of third year. This is the price of the share at the end of fourth year. That means, do you have the price for 5 years or only 4 years? 4 years. If you have data for 4 years, you will calculate return also for 4 years. Got it, everybody? Quickly make me happy. First year ka return, quickly do it and tell. How do you get first year ka return? First year ka return, how do you get? First year ka return is denoted by the symbol what? 1 plus y1. That is given by the formula what? D1 plus P1 divided by P0. So D1 is how much? 1. P1 is how much? 9.75 divided by P0. P0 is how much here? 9 rupees. So do this. 1.19. Like this we'll have to do for 4 years. Everybody cool? Okay. Now, and that's what I've done here. One is good. You've got the hang of it, so I'll not waste time there. So first year ka return is 1.11. Easy people, 1.19. Okay, second year ka dividend. Just tell me the formula. Second year ka return is given with the formula D2 plus P2 divided by P1. All the data is already given there. Is it okay? Can we trust my calculation? Yeah. So second year ka return is how much? 1.28. Third year ka similarly applying the formula, you will get 1.06. Fourth year ka 1.07. Since they've given you the information only for 4 years, we calculated the return only for 4 years. Now take your calculator, multiply all this return. 4 years ka return, whatever is there, multiply. All the 4 years ka return, you multiply. Quickly. Sir, we will pay you in the form of kind, successful result. Ah, okay, much. That is more than happy to collect that. Yeah. So multiplying all this, you will get some number. 1 point something. Okay. We have to find out square root or fourth root? Fourth root. Sir, fourth root means you have this button square root in your calculator, right? 1 times if you press no, it is like 2. Square root means always 2. You have to find out square root or fourth root. That means this particular button you press 2 times. This button in your calculator, press 2 times. How much are you getting? You should be getting 1.1464. Yes, sir, people. Then minus 1 you do finally. Minus 1 you do. How much are you getting? 4.1464. All right. Sir, all this number we have taken in decimals. Right? That means you have to convert this in percentage. So the percentage will be how much? 14.64%. This is your geometric mean ka application. Finding out cost of equity using this. So check the data and accordingly do the calculations. Yes, people. So with this cost of equity ka drama also we have done. If you need a minute, I'll wait or online. So far, okay? By the way, all this question what I picked up are from study material also. It's there in our class notes also. It's there in study material also. And I have not done anything extra. I've copy pasted ICA materials. That is only is my class material. And along with that, some RTP, MTP previous year question also I have attached. That's all is the cut and paste activity I've done in my notes. Okay. Yes, sir. This is done. They are saying yes, sir. Yes, sir. Move on, sir. What else you'll teach, sir? This is done. Next auto. Till you're good. Oh. So, okay. One more is there, sir. One more is there, which is cost of retained. So, till now we did cost of debt. We did cost of preference shares. We did cost of equity. Now, next cost of retained earnings denoted by the symbol KR. Cost of retained earnings ka symbol is KR. So, retained earnings means, just now, retained earnings means what, sir? Earnings given as dividend or earnings kept by the company? Sir, earnings distributed by the company, we call it as a dividend. Okay. Earnings retained or earnings kept by the company only, we call it as retained earnings. Okay. So let's take this. You know this format now. From EBIT, if you reduce interest, what are you going to get? Earnings before tax. From earnings before tax, if you reduce tax, what are you going to get? Earnings after tax. I've assumed some random numbers just for this. All these are assumed numbers. 1 lakh is the EBIT, 10,000 is the interest I've assumed. So you get EBT of 90,000. 90,000 ka 30% if you do, you'll get 27,000. Earnings after tax will be 63,000. Then preference dividend is 10,000. Okay. Because after you pay tax, will you pay dividend to equity shareholders first or preference dividend first? Preference dividend. Let's assume preference dividend paid is 10,000. So how much money remains? 53,000. From earnings after tax, if you reduce preference dividend, you'll get number. No, that number only we call it as EASH. EASH means earnings available or attributable to equity shareholders, or it is also referred to as net income. Okay, you can either call it as net income or, in fact, for AS20 when I did EPS, I used to use this terminology EASH. Same thing I've used since accounts may used EASH. In FMA, I continued with the same. But our ICA does not call EASH. Either they will say full form, that is earnings available to equity shareholders, or directly they call it as net income. Now you tell me, sir, this 53,000 belongs to whom? Preference dividend is already paid. That means this 53,000 entirely belongs to equity shareholders. Correct? That's the reason the name is EASH. EASH means earnings available to equity shareholders. This much earnings is available. Can company give entire 53,000 as dividend if they want? Yes. But suppose the company, crazy fellows, they only paid a 20,000 dividend. How much equity dividend company gave? In 53, I said 20 gone means how much remains? 33,000. This 33,000 of earnings company distributed or retained. This only we call it as RE. RE for retained earnings. No, stop. This 33,000 also belongs to whom? Equity shareholders. Okay. Now, equity shareholders, are they getting this 33,000 now, or did they sacrifice? Ideally, how much dividend they should have got? If 53,000 was earnings available to them, means the dividend also should be 53. Did they get 50 dividend or only 20? How much dividend they sacrificed or did not get? 33. That cost only we call it as cost of retained. Because even this 33,000 also belongs to equity shareholders only. Sir, will equity shareholders sacrifice just like that, or they will put reason? They will put some condition. What condition equity shareholders will tell? Boss, you have not paid me 33,000. Equity shareholders is telling the company, you have not paid me 33,000. Use this money to grow the business. Now, ArivuPro, when we did business, we started a branch in Bengaluru. Entire profit we gave to equity shareholders. No, we retained that profit and we opened new branches. Correct or no? If you open new branches, means earnings for equity shareholders will be same or it will increase? That is what it is. For the time being, equity shareholders are sacrificing how much? 33,000. Will they sacrifice this at free of cost, or they will expect something out of this? They will expect something out of this. On that expectation only we call it as cost of retained earnings. This is the cost of dividend sacrificed by the equity shareholders, denoted by the symbol KR. Okay, sir. One good news for you. Cost of retained earnings and cost of equity calculation is ditto. Okay. But there is one differentiating factor. What is that? For equity shares, you will always get flotation cost. Flotation cost means what? Issue expenses. If the company is issuing new shares, means they may have to take the help of an underwriter or broker. There will be a brokerage. When company issues new shares, they may have to file some documents with ROC. There will be some ROC charges. All that only we call it as what, sir? Flotation cost. For retained earnings, will there be any flotation cost, or it's already issued? This 33,000, can you issue any instrument? No. That means for this 33,000, will there be any flotation cost or no flotation cost? So when you're calculating equity shares cost, consider flotation cost. Same formula, same formats. But for finding out cost of equity shares, you will take flotation cost. But when you're finding cost of retained earnings, will you take flotation cost or don't take? Don't take. That's all. That means it's the same formula. Tell me the formula once again. Let's see. Cost of equity first formula is what? Dividend price approach. In dividend price approach, the formula was dividend divided by price. Dividend divided by P naught. In earnings price approach, EPS divided by MPS or EPS divided by P naught. Okay. In Gordon's growth formula, the formula for cost of equity was D naught into 1 plus growth rate divided by P naught minus flotation cost, whole thing added by growth rate. Now calculate the same cost, Gordon's cost of retained earnings formula. You tell me, how do you get? Same, D naught into 1 plus growth rate divided by P naught minus flotation cost I should do or I should not do, plus the growth rate. That's flotation cost. That's all it is. Okay, sir. Okay, that's what I've written over here. For cost of retained earnings, it's the same formula, same steps, but without flotation cost. Done, G. And there is another way also to calculate. Sir, if they give you cost of equity, through cost of equity, you can find out cost of retained earnings. Okay, rare, but sometimes for 2-marker MCQ, this can be given. So cost, if they will give you cost of equity, using this we have to find out cost of retained earnings. So cost of retained earnings is given with the formula cost of equity. For cost of retained earnings, flotation cost will be there or it will not be there. So hence you do 1 minus flotation cost. Take cost of equity and multiply by 1 minus flotation cost into 1 minus TP. TP for personal tax rate. An investor, if he gets any return, means now if I earn some income, on my income I have to pay tax to the government. That tax only we call it as personal tax. This is a tax for the company or tax for individual. That individual tax rate only is denoted by the symbol TP, or also known as personal tax rate. Okay. So if they give this, take it. According to me, this should be ignored. Why? Because every individual will pay same tax rate or different. Depending on my income, I have different slab rates. I mean, should this be considered? Because do we have one tax rates in India or multiple? Multiple. So ideally, this should be ignored, but let's not question the question. For now, it is there. So we'll go ahead with that. So cost of retained earnings is given by the formula cost of equity into 1 minus flotation cost into 1 minus TP. TP for personal tax rate. Another way to get the cost of retained earnings. That's it, sir. 4 damar. 2 more means this particular topic totally damar. Sir, what is damar? Damar means over. Okay, ji. All right, let's do a thing. Let's see how much attention have you really paid. How much was it worth for me to come from Bangalore to Coimbatore now? Recap. Cost, chapter name? Cost of equity. Here, equity here refers to finance. Finance means short-term finance or only long-term finance? Only long-term finances. We find 6 components here. What are the 6 components? Cost of debt, cost of preference shares, cost of equity, cost of retained earnings. Other 2 we have not discussed so far. Leave it. Sir, how do you find, sir? First of all, here cost means the actual cost or the return expected. The return expected by the providers of finance or the return expected by the investor only is called as cost of capital. So first we will find the cost of the long-term debt. Cost of the long-term debt is denoted by the symbol KD. Whenever we have long-term debt, we need to check whether they are irredeemable or redeemable. If it is irredeemable, cost of debt is given by the formula. Simple way, payment divided by receipt. Payment for company is what? Interest. So that means the formula will be, should we take interest or after tax interest? That means cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds, NP, right? I for interest amount, T for tax rate, NP for net proceeds. How do you get net proceeds? That you need to check whether these are new debt or existing debt. New debt means first priority, issue price. IP missing, market value. Market value also missing, face value. Okay, then if it is existing debt means first priority, market value. Missing, face value. Whether you take whatever, it doesn't matter. Flotation cost compulsorily you need to minus. Okay, then you will automatically get the net proceeds. However, if it's a redeemable debt, then the formula will be cost of debt is given by the formula interest into 1 minus tax rate plus RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. RV here stands for redemption value, NP for net proceeds, N for remaining life. Okay, so fine, that is the way to calculate it. Okay, next, this 2 method we call it as approximation method. You can find out the cost of debt using IRR method also. If you're using IRR method, you have to plug in what? The format. First you will take year. Year may you will start with year 0. Year 0 means now. Year 1 ka beginning only we call it as year 0. Then if the instrument for 5 years means, you write 1, 2, 3, 4, 5. Okay. Should you have to calculate all the 5 years or shortcut method? In case of debentures, we will have different interest every year or same interest? Same. That means you will write 1, 2, 3, 4, 5 or 1 to 5? 1 to 5. Then you will take interest. Interest or after tax interest? After tax interest. Then 5th year again you will take redemption value. Okay, 3 things. Year 0 may you will take net proceeds. Tell me net proceeds, visualize. You will put the signs from company perspective or investor perspective? Because IRR is a return. For company it's a return or investor? Investor. So that means for investor to get the debenture, first he has to buy the debenture. So buying the debenture for him is an outflow or inflow? Outflow. So that means year 0, net proceeds you will show it as negative. After tax interest and all you will show it as positive. Redemption value also as positive. Then assume 2 discount factors. Your choice. Find out NPV. If the rate that you have assumed is correct, means NPV will become 0 because IRR is a rate at which present value of cash inflow and present value of cash outflow will be same. Okay, will you get 0 or some other number? Some other number. Then plug this number and take this number and plug it in one interpolation ka formula. Formula is given by lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Sir, which method to use? Formula method or IRR method? Question will specify. Otherwise, your choice. Then cost of preference shares. Cost of preference shares also first you need to check whether they are irredeemable or redeemable. If it is irredeemable, dividend divided by net proceeds. For dividend, will you get tax benefit? No. That means you will simply take, don't say dividend, say preference dividend divided by net proceeds. Okay. Then if it is redeemable means preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Great. Okay. The next one is, or you can also use, these 2 methods are approximation method, or instead of approximation, you can go for IRR method also. Next, we looked at cost of equity shares. For equity shares, there are multiple formulas. One is dividend price approach, given by the formula dividend divided by, or dividend per share divided by P, right? Price of one equity shares. Then in this method, dividend is assumed to be constant. Then earnings price approach. Okay, cost of equity is given by the formula earnings EPS divided by MPS, or EPS divided by P naught also you can call it. In earnings price approach, we assume earnings to be constant. Then we have Gordon's growth model. In Gordon का growth model, cost of equity is given by the formula D naught into 1 plus growth rate divided by P naught minus flotation cost, whole thing added by growth rate. To find out growth rate, we can take B multiplied by R or trial and error method or future value table, which I'll discuss through one problem. Okay, that is done. Next, we have capital asset pricing model. So cost of equity is given by the formula RF, risk-free rate of return, plus beta into RM minus RF. RM is your market return. RF is your risk-free rate of return. From market, RM minus RF, if you do, whatever number you get, that number only we call it as risk premium, meaning by taking risk, how much extra risk are you, or how much extra return are you getting. Okay, that is your CAPM model, right? Then we looked at IRR, yield to maturity approach or IRR method. Here you need to check whether year-wise return is you can calculate or you cannot calculate. For you to calculate year-wise return, you should know every year ka dividend also, every year ka price also. If that is given means, if they give you 4 years ka data, then you will calculate return for 4 years. First year ka return is denoted by the symbol 1 plus Y1, given by the formula D1 plus P1 divided by P0. Second year ka denoted by the formula 1 plus Y2, given by D2 plus P2 divided by P1. Third year ka D3 plus P3 divided by P2. Fourth year ka D4 plus P4 divided by P3. All the 4 years ka return you multiply and find out the fourth root. Fourth root plus the square root button 2 times. Minus 1 you do and convert the final answer into percentage. Or if year-wise return, if it is not given, go for your normal IRR approach. Okay, sir. And then cost of retained earnings. Cost of retained earnings and cost of equity ka calculations are same. Except that for retained earnings, you should not take a flotation cost. Without flotation cost, calculate the same way. If they give you cost of equity, there is one more way to get cost of retained earnings. How do you get that? Cost of retained earnings is given by cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. This is now we have done till in this 1.5 hours ka session. Okay, sir. 2 more concepts, another 2 more questions. This particular chapter ka revision is more or less done. Can we move on? All right. Next is, yes, realized yield approach is under equity. Correct. Okay, next one is something called weighted average cost of capital denoted by the symbol KO. All right, this we also call it as weighted average cost of capital. It's also known as cutoff rate. It is known as hurdle rate. Okay, it's also known as overall cost of capital. Multiple names, meaning is the same. Now, what is this? Why do we need this? Okay, let's take a simple example. Sir, I want to start a particular project. I need 100 crores funding for that. A big project I want to start, and how much money I need? 100 crore. Now I feel 30% money, that is 30 crore, I will take it from debt. Out of this 100 crore, 30 crore I will raise by issuing new debt. 70 crore rupees I will raise by issuing new equity shares. Okay, sir. That means one source of finance or multiple. Equity also, debt also. Okay, debt 30 crore, equity ka 70 crore assumption. Sir, these two will have same cost or different cost? Different cost. Obviously, sir, equity shareholders take more risk. Right? That means will they expect same return or higher return? Higher return. Let's say the cost of debt is 10%. Equity ka cost is 15%. Assumption. Okay, people. Now, sir, and this particular project is expecting to give a return of 14%. By doing this project, I am assuming that I will get how much return? 14%. Now, should I accept this project or reject it? Should I accept the project or reject it? So, how will you find out the answer for that? Sir, simple. Sir, how much return is my project expecting? 14%. Let's say I raised entire money through equity shares. Assumption. Okay. And how much equity shareholders are expecting? 15%. Okay. Sir, to do the project, how much cost I have to incur? 15%. But that project is giving the company how much return? Return is 14%, but the cost is 15%. So that means will you accept this project or reject this project? Reject this project. So to accept or reject the project, simply we compare the return with the cost. We compare return of the project with the cost. But here in this particular example, did I raise the money from one source or two sources? Did the money entirely come from equity shares or also through debt? Debt. Okay. And both are having same cost or different? So hence what, sir? To do this decision, we can't take the decision with the help of this. We have to find out one average cost. You have to find one average cost. That average cost only we call it as what? Weighted average cost denoted by the symbol KO. Got it? Everybody cool? Okay. That means how do you find average? Sir, you know this. If you give you two things and ask you to find average, how will you do that? 10 plus 15 divided by 2, 25 divided by 2, you'll get 12.5. Correct? No. This we call it as simple average. This we call it as simple average. Sir, did you raise the same amount of money from both those sources or different? That means taking simple average would make sense, huh? No. Since the funding has come through different amount, you can't take simple average. We have to take a weighted average cost of capital. Instead of simple average, we take a weighted average cost. I mean, is this a new thing to us or one extra fitting? Extra fitting, that's all it is. So weighted average cost of capital is not a new concept. It is just an add-on or an additional concept. That's it. Okay, sir. How to find it? Let's take this example and do it. We'll also take a one question. Now, very simple. Sir, to find out weighted average cost of capital, first you have to find out the after tax cost of all the instrument. In this my particular example, how many instrument have you issued? 2. That means you have to find out cost of debt, and then you have to find out cost of equity. So how do you find out cost of debt? Approximation method or IRR method. How do you find out cost of equity? We have multiple method. Question will tell. One among that we will choose. Okay. That means to calculate weighted average cost of capital, whatever we have discussed till now, first we'll have to do that. Yes. So here I've already calculated. How much is the cost of debt? 10%. How much is the cost of equity? 15%. Take that. 10 and 15. Okay, G. Is it a simple average or weighted average? Weighted average. So take how many sources of finance did you raise the money? 2. What are those? Debt and equity. How much money came through debt? 30. How much through equity? 70 crore. 30 and 70. Ignore this. It's okay. Fine, it's lakhs of whatever. All right. That means out of, let's maybe make it as 100 lakh only. It's okay. I've written over here. Easy to. Okay. Instead of 100 crore, make it as 100 lakh. So out of 100 lakh, 30 lakh has come through debt and 70 lakh has come through equity. Tell me the percentage, sir. Out of 100, how much has come through debt? 30 lakh. What percentage? Out of 100 lakh, 30 has come through debt means what is debt ka percentage? 30 divided by 100 and 30 divided by 100 into 100 if you do, how much are you going to get? 30%. Meaning 30% of my funding has come through debt. Either you can take it in percentage or you can take it in decimals. Choice is yours. I prefer the decimals to avoid some mistakes. So what is the weightage of debt here? In my current scenario, the weightage of debt is only 30% or 0.3. So what is the weightage of equity? Out of 100 lakh, 70 lakh has come through equity. That means 70% of the funding is arranged through equity. That is 0.7. Okay, Saru. Simply take that instrument ka weight. Simply take that instrument ka weight and multiply by that instrument ka cost. You will get KO. To get overall cost of capital, it's weighted average cost of capital. No? Simply take that instrument ka cost. Multiply by that instrument ka weight. What is the cost of debt? 10%. What is the weightage of debt? 30%. So multiply these two. How much is it? 3%. Similarly, what is the weightage of equity? 70%. What is the cost of equity, I assume? 15. So 15 into 70% if you do, you'll get 10.5. Add these two. If you add, you're going to get how much? 13.5. That only we call it as overall cost of capital denoted by the symbol KO. Now you can tell me the decision. So this project was expected to give how much return? 14%. What is the weighted average cost? 13.5. Return is 14%. Overall cost is 13.5. That means this project should be rejected or accepted. Accepted. Why? Because the return from the project is greater than. If the return is greater than overall cost of capital means you accept. If the return is lesser than the overall cost of capital means reject. That's your accept reject wala decision. Okay, people. This is your WACC. Now you tell me, is this a new method for us or just one extra working? Just one extra working. That's all it is. Move on to the next. Last concept theoretically is MCC. Is a MCC, not Madras Cricket Club. It is marginal cost of capital. MCC ka full form is marginal cost of capital. Marginal cost of capital is very simple. MCC means what is the cost of raising additional funds. Only the cost of raising the additional finance we call it as MCC. Sir, I didn't understand. Okay. Let's say company has existing equity share capital 10 lakh. They already have existing debt how much? 5 lakh. That means what is the capital employed by the company? And one thing, stop. Sir, in FMA, when we say C for capital employed. In FMA, whenever we say capital employed, it is not share capital and preference share capital. Capital employed in FM means all your long-term funds. All your long-term funds put together, we call it as capital employed. Capital employed here means equity share capital plus reserves in surplus plus preference share capital plus all your long-term debt. Everything, if you add that number only, we call it as capital employed. Okay, sir. What is the total capital employed currently? 15 lakh. Now stop. For this 15 lakh, if you find KO, for this existing capital employed, if you find KO, we call it as weighted average cost of capital. Okay, ji. Now company want to do some expansion program and they need additional 30 lakh. They need extra how much money? 30 lakh. This 30 lakh they took. How? 20 lakh through equity, 10 lakh through additional debt. How much additional fund they raised? 30 lakh. If you find KO only for this new funds, that to be call it as what's our MCC. Calculation step ditto. Calculation step for MCC also, you put up the same table and calculate. Just that MCC means you're not finding the cost for all your capital. You are finding the overall cost only for the new funds. Only for the additional funds or new funds, if you find out KO, that is referred to as what? MCC. But way of calculating MCC is also ditto. No change. Carry on. Yes, people. Okay. Sir, you already had how much equity? 10 lakh. How much extra equity you raised? 20. That means now you have how much? 30 lakh. How much debt you had? 5 lakh. How much additional you raised? 10 lakh. How much now you have? 15 lakh. That means what is your total capital employed now? For this, if you find KO, again it is called as what? WACC. MCC means cost of KO only for what? Additional funds. Only KO for additional funds, we call it as MCC. If you find out KO for entire capital, that is always called as weighted average cost of capital itself. Okay, that's all is it theoretically we had to know from this particular question. Okay, now we have some questions. Can we take 1 or 2 questions and move forward? Okay. 1 minute, let me find that. This points, I'll come to it. There's a problem specific pointer. Where is that? Question. This one we will find out. I have some time, maybe another 20-25 minutes, about maybe half an hour we have more for this allocated time for this topic. In half an hour, how much ever questions we can, we'll try to solve it. And then we will move on to the next chapter. Now check. Calculate the WA. What is today's agenda? Today's agenda is to sit and learn, Aditya. Okay, 3 topics first. C4, C5 and C6. Cost of capital, capital structure, leverage. Those are the 3 topics we will be doing today. Okay, whatever time. I don't know about the time. It may be 2:33 also. I don't know. The time, if you finish by 2 o'clock means happy to go at 2 o'clock. If it takes till 4 means happy to sit till 4 o'clock. Either ways, we are happy. Yeah, all right. That is the 3 topics ka target today. Tomorrow I will take up another 3 topic. I'll also tell you. Last day, actually, I thought I'll do RTP, MTP later on. Then anyway, I have beautiful audience like you know. When will I ever meet you again? No, correct. No. So RTP, MTP, I will cover in this marathon. FM ka RTP and MTP 1 is there. No, that also I will cover it off. So that's the reason I will take the session little longer. Initially, I had planned to take only from 7:30 to 2 o'clock. Now, since RTP, MTP also came in, extra I need to put 3-4 hours more. Okay, maybe I don't know how much time. Maybe at least 3 hours may be required. So we have to stretch daily a little more. Okay, now you're okay with this? No. If you don't like it means, then it's okay. I'll do RTP, MTP in Bengaluru. Or we'll do it here in Coimbatore only. Namma koila pandlama. Okay, fine, sir. We can stretch, sir. It's okay. Do it, sir. No problem. We will do it here. Fine. Okay. Cool. No problem. Anyway, after this class, I also don't have anything. No. Anyway, go home and chill only. So it's okay. I don't mind stretching today. At least Bangalore may will do something. Here, what I'll do? Chill only, no? Okay. Question number 21. Calculate WACC using from the following data by using home, sir. What home da? No, da. We are doing the session in Coimbatore. Da. Coimbatore is not my place, da, macha. I've come here only for this 3 days. All right. So what you will do after class? That I will tell you later. Why waste time? No marathon. Some of them are actually looking at marathon. They're like, hey, you do the topic, da. Other talks you do it. No, not going home, much. Hotel. Okay. Calculate which hotel. Hey, watch this. Question number 21. Calculate KO using book value weights and market value weights. Sir, 1 second. To calculate KO, we need weights. To calculate KO, we need weights. Weights can be calculated either using book value or Market value. Book value means, let's say company has issued, here check. Company has already issued equity shares, how much? Check here, the question, what are they saying over here? 1 minute. Equity shares, the capital structure of the company is as follows. Capital structure means the company has already issued this. The company has already issued. How much equity share capital they already have? 10 lakh, right? This is the market value of equity shares, or this is as per our books. This, if you use this and find out weights, we say we are using book value. We're finding weights using book value. Now, sir, you have issued these equity shares at what value? Sir, in the books, equity share capital is always shown at what value? Face value. What is the face value of one equity share? 10 rupees. Sir, face value is 10 means market value also should be 10, or it could be anything. Anything. Here, check what is the market value of equity shares? 24. So that means how many equity shares here we have? Check, tell me. Sir, total equity share capital is 10 lakh. Each company ka equity share, face value of each share is 10 rupees. That means how many shares we have? 1 lakh shares of 10 each. Sir, we have 1 lakh shares and each share ka market value is how much? 24. That means what is the market value? 24 lakh. We can take this particular value and find out weights, or you can take 10 lakh and find out weights. If you take 10 lakh and find out weights, we call it as book value. If you take 24 lakh and find out weights, we call it as market value. So which one to use? Question will specify. Whether to take book value or market value, question will tell. Here, check. Here they've asked find out KO using both book value and market value. Like that they will tell. Sir, if it is not mentioned means, sir, if it is not mentioned, first priority always for market value. Why? Sir, did you issue this equity shares today or many years back? We don't know when. This could have issued last year, 10 years before, whenever. We are finding the overall cost of capital. Suppose this equity shares was issued 5 years back. This equity shares was issued 5 years back. Are you finding the KO 5 years back or today? Today. That means should you take today's value or 5 years back value? Today's value. Today's value is what? Market value. Hence, first priority always for the market value. Okay. If nothing is mentioned, always prioritize what? Market value. Okay. If market value is missing, then you will go for book value. Or if question says find out using book value means no questions asked further. We will compulsorily take book value like that. Nanji. Okay. Now read this data. Using book value and market value, we need to find out KO. Capital structure of the company is given as follows. Debenture. Rupees 100 per debenture. That means the face value of each debenture is how much? 100. What is the total face value? 5 lakh. Preference share capital. Each preference shares ka face value? 100. Total preference share capital? 5 lakh. Equity shares. Each share ka face value? 10. Total face value? 10 lakh rupees that they have given. So this is what here, this only we call it as capital employed. So the total capital employed or total long-term source of finance company already has raised is 20 lakh. Then they have given market price of these securities. Debenture ka face value may be 100, but their market value is 105. Like shares, debentures are also traded in the market. There are certain platforms through which you can buy debentures also. Golden Pie, etc., some platforms which I am aware of. Similarly, preference shares ka face value how much? 100, but market value is 110. Equity shares face value 10, but their market value is 24. Okay, now check. To find out KO, first we need what? Each source of finance ka after tax cost of capital. Here we have debentures. That means first we need to find out what? Cost of debt. We have preference shares. So we need to find out KP. We have equity shares. We need to find cost of equity. So first find KD, KP, KE as a working notes. Then you can calculate overall cost of capital. Can we do it? Okay, now for that they have given the data. One by one we will go. Rupees 100 per debenture. Redeemable at par. Okay, the first word only killer. They gave redeemable. That means this is irredeemable debt or redeemable debt? Redeemable debt. Okay. And the redeemable at par. That means the redemption value. Redeemable at par means face value. What is the face value of each debenture? The face value of each debenture is 100. That means the redemption value is also 100. Okay, sir. 10% coupon rate. Coupon rate means interest rate. On this debenture, company is paying how much interest rate? 10%. 4% flotation cost. Should we ignore or consider? Consider. And 10-year maturity. That means 10 becomes your N. This actually 10-year maturity means 10 is your total life. N is total life or remaining life? Remaining life. But have they told only 3 years debentures remaining, 2 years debentures remaining, like that have they told? No. So absence of information, we are assuming that the total life and remaining life are same in this problem. No data. Suppose if they had told remaining life is 4 years, then I would have taken n to be what? 4. That info is not there. Hence we are taking n to be 10 in this particular question. Yes, people. You smile. You're smiling. Why? Sir, all the data given, sir, patapat, I'll plug the number into formula and get the answer. Your mind to heart to kidney, everything is saying approximation method. But look at ICI. Use yield to maturity method to do cost of debt. That is the reason little bit patience always you should have. You should not read off and start off. Okay, because many students will do this. They'll do exam and super damacha, full 50 and 50 I will get damacha. Sir, they solved using approximation method, but the requirement was yield to maturity. I mean, literally 0. Okay, like this institute will not give the information at one place. They will scatter, put the information at different place. One's always give the question full read. Josh may don't start off. That means we can't use this. We'll have to go for IRR method. Can we do it? Okay, you know. Tell me IRR. Quickly tell me format. Year. Stop. Year. Complete the year for me. 0 and 1. You'll write 1, 2, 3, 4, 5, 6, 7, 8, 10 or 1 to 10. 1 to 10. Because will the interest change every year or same? That means for interest, will we use PVIF or PVAF? Then last 10th year mein redemption value. And redemption value is how much? 100. Will you take I or will you take after tax interest? After tax. Can we plug this now? Okay, calculate, sir. Or simply tell me some data. First we will write the data. What is I? I we need or interest into 1 minus tax rate? Interest is always calculated on the face value. What is the face value of debenture? 100. What is the coupon rate or interest rate? 10. 100 ka 10% is how much? 10. That means interest is 10 into 1 minus tax rate. Tax rate somewhere they must have given here. Check. The tax rate is 30%. So 0.3. So that means this will be 7. Okay. So 7 rupees is after tax interest. Got one data. Then we need this is one data we need. Next we need what, sir? Net proceeds. How do you get net proceeds? First priority, issue price. Have they given? No. Where? First of all, is this new debenture or existing debenture? For existing debt, will we first prioritize IP or market price? Market price. What is the market price of the debenture? 105. So first we will take market price. Only market price or minus flotation cost? So market price is 105. How much is flotation cost? 4%. Sir, 4% we have to apply on face value, sir. No, 4% you apply it on market value. If the question says apply flotation cost on face value, then you will calculate it on face value. Here, have they mentioned anything? No. Then calculate on face value. 105 minus 4% you do. How much you going to get? 100.8. This is your net proceeds. Got this data. So interest we got, net proceeds we got. Then last we need RV. Right? How much is RV? They are redeemable at par. So RV is 100. All the data we have. Quickly can we review this? Okay, keep this mental note. Interest is how much? 7. NP is 100.8 and RV is 100. Now look at the solution I've solved. Where is that? KD. Where is KD? KD. Year column. 1 second. Year column. First we'll write year 0. In year 0, what will we write? Don't look at the board. Year 0. Visualize. Year 0 means now. To buy first, we're putting the sign from company perspective or investor perspective? Sir, investor to get the return, first he has to buy the debenture. First he has to buy the debentures. When he has to buy the debentures, first you have to invest how much? Net proceeds. How much is the net proceeds we calculated? Net proceeds we calculated as 100.8. Yes, 100.8 is the net proceeds which I have taken here. Where it went? This is one. Okay, sir. Then year 1 to 10. In year 1 to 10, will we take interest or after tax interest? Which we calculated to be 7. 10th year, you will take redemption value. And redemption value was 100. Okay, sir. Then you got your year and then you got your cash flows. Then you'll have to assume discount factor. You'll have to assume discount factor. Correct. Now, what discount factor to assume? Many students now will have this issue. In class, I will say take 10%. So, bindas, you will take 10%. But in exam, you have to assume. And we are not comfortable. We are comfortable going like this. If I tell you, go whichever way you want, but reach there. You'll be like, this road, that road. Confusion is always there. If you are having that confusion, how to sort? There is one quick shortcut way, or not shortcut, there is one fix to determine what discount factor to take. There is one way to assume what discount factor to take to get very close answer. It'll take 1 minute extra, but it'll give you a closer answer. What is that? Simple. You have only IRR method to calculate cost of debt or even approximation method? Approximation. First find out approximation method. First find out. You don't have to solve fully. Just calculator me you can get it. No. Quickly calculate cost of debt using approximation. They've asked approximation method? No. Why do I calculate that? I'll tell you. Tell me under approximation method, what is the formula? First of all, this is irredeemable or redeemable? This is a redeemable debt and I have given you all the data here. So what is the redeemable debt formula? Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay, let's take that up. That's what I've solved it here. Check. Okay. This one. After tax interest into 1 minus tax rate is this. Plus RV. RV we already know, which is 100. Minus NP is 100.8. Divided by N. N was 10 here. Whole thing divided by RV plus NP divided by 2. When we do that, we're getting how much answer? 6.8. Sir, approximation method and IRR method will not give same answer. But it will give more or less close answers. It will give a close answer. That means what is the cost of debt as per approximation method? 6.89. Take one. In IRR method, we have to assume 2 discount factor. Take one number before this, one number after that. What is one number before this? 5. One number after this is how much? 7. That means the discount factor I'll assume is 5 and 7 to get close answer. This is one way you can sort it out if you want. Otherwise, you can take 10, you can play around. Okay. So based on the discount factor you assume, the final answer will change. But if you want a close enough answer, this is one quick fix. And this you don't have to solve in your paper. You can solve it in your calculator as a rough work. This is done. Why, sir? Why did I calculate? This is not asked in this problem. Why did I still calculate? To know which discount factor to assume or which close enough discount factor to assume. Now tell me which discount factor I will assume for IRR method here. One number before this, which is 5. One number after this, which is 7. Somewhere it will be in that. So discount factor is 5 and discount factor is 7. And should I have to solve this or you know this? Discount factor. At year 0, the discount factor is 1. For interest, will we take PVIF or PVAF? At 5% for 10 years, what is PVAF? Quickly tell me, how do you calculate? Here you will take what? How do you get discount factor? 1 divided by 1 plus I whole power n. So here you will do 1 divided by 1.05. Press equals to button how many times? 10 times. If you press 10 times, you will get what, sir? 0.6139. That is the number your number will show in calculator. This is 10th year ka discount factor. We need 10th year ka discount factor for all the 10 years. Then press GT button. When you press GT button, you will get 7.72. So this is your PVAF and this is your PVIF. Multiply. And when you do it, finally you will get NPV how much? 14. Okay. If 5% was my IRR, means NPV should have been 14 or it should be 0. 0. Is it 0? No. That means one more rate. I'm assuming it at what? 7%. At 7% again I'll calculate. I got a negative number. Okay, people. Ideal scenario as per our ICA is when you assume the two rates. No, one NPV should be positive, another NPV should be negative. Though as close as possible is what ICA solves. Okay. But anyway, I'll leave it to your choice how you want to do it. Then plug this number in interpolation formula, which you already know in your sleep also. You should tell this. That is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus this. Got your K. Done, G. Is this a new thing or ditto? Ditto. Like this question over, or we have to find KP also. KP. We have solved this in class. Yes, master. All these are class questions only. Yeah. Okay. Now we find out KP. But KP also you have to find how? Using which method? YT method only. ICA doesn't like you. They want you to waste time. Formula means you'll get it faster. No. IRR means you need to calculate a little more. It will take a little extra time. Now check. Let's find out the data. Preference shares ka face value how much? 100. They are redeemable at par. That means redemption value for preference shares is also 100. 5% coupon rate. Coupon for preference shares means a dividend rate. On preference shares you pay preference dividend. What is the preference dividend rate? 5%. That means tell me, sir, how much is PD? PD preference dividend. Dividend is always calculated on the face value. Face value is 100 and the dividend rate is 5% means 100 ka 5%, which is 5 rupees. Should we take after tax preference dividend or preference dividend itself? Preference dividend. Because on preference dividend, will you get tax benefit or no tax benefit? No tax benefit. That's the reason. Okay, sir. All right. Next, 2% flotation cost and 10-year maturity. 10-year maturity becomes your N. Okay, let's calculate. Okay. Now again, we have to calculate using IRR method, but To know which discount factor, first we will calculate KP using approximation method. Tell me the formula again. What is that? Preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Let's just calculate NP for me over here. That's all. NP. How do you get NP? How do you get NP? Sir, is our new preference shares or existing? Existing. Do you know market value? Yeah. Each preference shares ka market value is how much? 110. So take 110. Take 110 and you have to reduce the flotation cost. How much is flotation cost? 2%. So 102 ka 10 to 110 ka 2% you reduce, sir. How much is it? Huh? 107.8. 107.8 is your net proceeds. Okay, now we have all the data. So let's calculate first KP. Where is KP? Here. Where is KP? Okay, I plugged in this number. Should I have to plug in or you got it? Should I have to take you through this? No, preference dividend is 5, which we got it. Yes, plus RV, which is 100, minus NP, you only told 107.8. That's the number you told, right? Divided by N, which is 10. Whole thing divided by average price. That way, if you do as per approximation method, what is KP? 4.06. Sir, we have to solve using this method or IRR method? IRR method. Now, what discount factor will you assume? One number before this, which is 3. One number after this, which is 5. So take 3% and 5% and find out IRR. Okay, Ji. Again, you know the columns. Tell me once again. Just quickly, orally, we will review. First, year. In year column, first you will start with year 0. Then, life is 10 years. So, you will write 1 to 10. Then, 10. Year 0, you will consider what? Net proceeds. Okay, net proceeds means investor will get the money or pay the money. Pay the money. So, inflow or outflow? Outflow. Then for 1 to 10 you will take preference dividend. Preference dividend for shareholder, outflow or inflow? Inflow. So negative or positive? Positive. Will you take after tax or preference dividend itself? Preference dividend itself. Last year you will also have to take RV. Okay, sir. RV is redeemable value at par itself. Then assume the discount factor and get NPV and plug the numbers into formula. I think we don't have to waste time in that. Got it? No. This is the way to calculate KP. So KD over KP over. We also have equity shares. For equity shares, what did they sell? Let's see. Equity shares has how much flotation cost? Watch out. It's not 4%. Josh, our mind is set. For the above two, they gave it in percentage. Here, they gave it in percentage or directly value. So, don't do 4%. It is not 4%. It is 4 rupees. And market price is how much? 24. Okay. So, next year expected dividend. Sir, dividend already paid, we call it as D0. Dividend already paid, we call it as D0. Dividend expected at the end of first year, we call it as what? D1. I mean, this 1 rupees is dividend paid or expected. I mean, this 1 rupees is D1. And they've given growth rate. Now, for cost of equity, we have various formulas. Which is the only formula which takes into account growth rate? Gordon-Sells. That means you have to find out indirectly cost of equity using Gordon-Sells model. That you already know. Quickly do it. How much is that? How do you get that? Gordon-Sells formula? You will take D0 or D1 here. D1 divided by P0 minus flotation cost. Whole thing added by the growth rate. D1 we already know, which is 1. Divided by P0. P0 is current market price. What is the current market price? 24. Minus, don't do 4%. Flotation cost is exactly 4. Whole thing added by the growth rate. What is growth rate? 5. So I'll take it in decimals. 0.05. Solve this. How much you're getting? 1 divided by 20 plus 0.05. When you solve, I don't know. I have got here. I'm getting here 10% or 0.1. Okay, people. 0.1, 10%. That's the number you're getting. Yes. So we got all this. We got KP, cost of equity, and as well as cost of debt. Did they ask that or they asked KO? They asked KO. Yes. So for KO, you know. What is that? Simply we have to take what? That instrument ka cost multiplied by that instrument ka weight. Right? So KO is simply given by this, where it went here. First, we'll calculate KO using book value. Using book value. Okay. First, source of finance. What are the 3 sources of finance we have here? Debentures, preference shares, and equity. First, we'll calculate using book value. Check the question. What is the book value of equity shares? Or debentures. Same data I'll copy. This is as per the books, no? 5 lakh, 5 lakh, and 10 lakh. 5 and 10. We have copied this. 5 lakh, 5 lakh, and 10 lakh. Done, people? Okay, now calculate the weight. What is the total capital employed? 20 lakh. Out of 20 lakh, 5 lakh has come through debentures. So what is debenture ka weightage? 5 lakh divided by 20 lakh. If you do, you'll get 0.25. 25% is the weightage of debentures. Out of 20 lakh, again 5 lakh has come through preference shares. So the weightage will be 5 lakh divided by 20 lakh. If you do, you'll get 0.25. Equity ka weightage, out of 20, 10 lakh has come through equity. So 10 lakh divided by 20 lakh, if you do, you'll get 0.5. This is weights of the respective instrument using book value. Okay, sir? And then after tax cost of capital. After tax cost of capital, we have to find or already found? Already found. For cost of preference shares, it is 4.08. For cost of preference shares, it is 4.06. Okay, I've taken it in full number. That's all. Instead of percentage, I've taken it as full value. And cost of equity shares is 10% or 0.1. Take that instrument ka cost and multiply that instrument ka weight. So these two ka multiplication, if you do, you'll get 0.172. If you don't like this number, you can directly take 6.89 percentage. That way also. If you take percentage, the answer also finally will be in percentage. Your choice. Some students will get confused whether both the number we should take percentage or not. Some confusion will come. That's the reason in the class always I've solved every problem with decimal itself. So that confusion is totally sorted. But I'll leave it to your judgment. Then people, so cost multiplied by the weight will give you, and add all that, finally you'll get how much? 0.774. Come convert this into percentage. This is one instrument ka cost or overall cost? That only is your KO using book value weightage. Need a minute to review or next? Paka okay? Over? Yes. Alright. And the next one is, they asked only this or also market value? Market value. So now means we need to find out the market value. Let's find out that. Okay, sir. Sir, how many debentures you have? Can you tell me? The total face value of the debenture is 5 lakh and the face value one debenture is 100. That means how many debentures we have? 5,000 debentures we totally have. And do you know the market value of one debenture? Yeah, 105. So we have totally 5,000 debentures and the market value of one debenture is 105, means what is the total market value? Quickly do it. 5 lakh. 5 lakh 25,000 is the market value of debentures. Easy. Similarly, we have totally 5 lakh preference share capital and each preference share capital ka face value is 100. If you do this, how many preference shares we have? 5,000. And each preference shares ka market value is how much? As given in the question, 110. So multiply, how much is this? 5 lakh? 5 lakh 50,000 is the market value of preference shares. 5 lakh 25 is the market value of debentures. 550 is the market value of preference shares. How many equity shares we have? 1 lakh. We already calculated. And the market value of one equity shares is how much? 24. That means the total market value will be 24 lakh. Take this and find out the weightage. 525, 550 and 24 lakh. See, I've copied that. 5 lakh 25,000. 5 lakh 25, 550 and 24 lakh. And if you add all this totally, how much are you going to get? 37 lakh 75,000. First, tell me, help me out. What is the weightage of debt now? Can you tell? Total market value is 34 lakh 35,000. In that 525 has come through debt. What is debt ka market value? 525 divided by 34.75 you do. 0.1516. Similarly, out of 3475, 550 has come through preference shares. So these two you divide. How much you going to get? 0.1582. This two you divide. 24 divided by 34.75. 0.6906. This is the respective weight of the instrument. Cost of capital will change or already found? Already found. Copy that. So that instrument ka cost multiplied by that instrument ka weight, you will get it. Okay. Like that you do it for all the things and then add everything. When you add everything, how much are you getting? 0.0858. That is nothing but your overall cost of capital. That's denoted by the symbol KO. But this we found out using market value. That's all this is all about. Done, G. Can I move on to the next one, G? Okay. One more I will tell you maybe. Maybe this one I'll not solve the whole problem, but I'll just tell you quickly in 1 minute. Sir, they will tell you to find out KO. They'll ask you to find out KO using market value. They'll ask you to find out KO using market value weightage. Okay, but check. In this instrument, let me check this question. This is question number 27 in our class notes. It's study material question only. So we have one source of finance or four? Four sources. What are that? Cost of equity, cost of retained earnings, cost of preference shares, cost of debt. We have four sources of instrument. Okay. Do you know book value of all the instrument? Yeah. That means, is it problem to find out weights or very easy? Very easy. Using book value, you can find out the dates very, very easily. Correct? But check. You have cost of equity as well as we have cost of retained earnings. Do you have market value of retained earnings or it's given only for equity? Check the question. You need to find out overall cost of capital using book value, also using market values. Book value is straightforward because book value is anyway given. But market value of retained earnings, this is not zero. This is question mark. It is not given. It is not given. How do you find? Now, Infosys ka shares, or let's say Reliance ka shares. Let's say Reliance ka share price is 1010 today. I don't know. I'm just assuming. Today ka Reliance market price is how much? 1010. Right? Sir, visualize your accounts. Accounts mein balance sheet you visualize. Think. What is the heading you will give? Shareholders funds. Under shareholders funds, what will you show? Equity share capital and reserves and surplus. Means equity share capital and reserves and surplus belongs to whom? Equity shareholders. Correct? No. If you buy any company ka equity shares, means you are entitled to get that company ka equity share capital and reserves and surplus. Yes. That means will reserves and surplus have a separate market value or it is included? Included. So when they give you 2 crore rupees as market value, this is not the market value for equity alone. This is the market value of equity and market value of retained earnings put together. This 2 crore rupees is the market value not of just equity share capital. Though they have mentioned this value for equity shares column, when you buy any shares in the market, you are entitled to get that company ka equity share capital and reserves and surplus. Hence, this 2 crore rupees is not the market value for equity shares. It is the market value for equity shares and retained earnings put together. Okay, sir. In this case, what we have to do? Very simple. What is the book value of equity share capital? What is the book value of equity share capital? 120 lakh. What is the book value of retained earnings? 30 lakh. What is the total market value? 2 crore rupees. This is the market value for only equity share capital or both? This is 2 crore rupees is the market value of both equity share capital and retained earnings. Now what you do is this 2 crore rupees you distribute in book value ratio. You distribute in book value ratio. What is the book value ratio? Equity ka book value is 120 lakh. Retained earnings ka book value is how much? 30 lakh. That's what you have to do. That way you will get the market value. That's what I've written here. Check. Book value of equity share capital is 120 lakhs. Book value of retained earnings is 30 lakh. What is the ratio of this? 120 lakh is to 30 lakh or 4 is to 1. Now, what is the market value they have given in the question? 2 crore. 2 crore is nothing but 200 lakhs. This 200 lakhs is the market value of both equity share capital and retained earnings. So, this 2 crores or 200 lakh, you apportion or distribute in 4:1 ratio. That way, you will get market value of equity share capital. What is market value of equity share capital? 2 crore ka 4/5. Similarly, here it will be 2 crore ka 1/5. That way, you will get the market value of the respective instrument. Rest all steps same. This is the only change in that particular question. Now, we are revising. So, let's not waste time in going through whole question. Only this is the extra fitting. Comfortable now? Okay. That is all right. Growth rate missing. I will tell you what to do. Okay. Next question, mate, is there. That's fine. Done ji. Okay ji. Next question pakla. 29 question we will do. One new adjustment. So, because of that, we will review this question quickly. Pace is okay, na? Unfortunately, I have to maintain this pace. Okay. Because I have to complete the whole paper. But is it too fast? I know after a few hours I'm asking, but I just wanted you to be comfortable. Because initially what happens, no? First half an hour, no? We may feel little fast. Then slowly we will get used to it. That's the reason I didn't ask this question initially. I asked it almost after 2 hours. Overall, happy with the way we revised chapter? We're going to do the same pace for other chapters also. Because see, I can slow down. I can cut down my pace. But the problem is if I cut down the pace, next question I'll not be able to do. Time up. I'll have to go for the next topic. I want to revise the concept also and back it up by few problems. Every problem I cannot do. In the class for this chapter only, I've done more than 35 questions. For this chapter alone. Now I can't revise 35 questions here. Okay. Agenda is very simple. See, market may usually marathon. I usually do marathon little more. Because my funda is simple. Sir, I take about, let's say I roughly take 125 to 130 hours to complete my FM classes. Little more than 130. At least 10% of that. 10 to 12% of that. That means around 15 to 16 hours I want to spend for marathon. That is a reasonable enough time to justify. 100% of the content I'm trying to cover in 15% of the available time. So pace I have to maintain a little faster, and problems I can't do everything. If you are feeling every problem I will do in marathon, sorry to disappoint you. You can watch some other faculty take a marathon if they are doing. you can drop out, because I don't want to give you false promises. Because many people know, they'll trust and they will take our class. Okay, regular class I can assure you that we'll do everything. But this is marathon. I'll not be. I can revise all the concepts, but problems like this, two, three questions I will take, whichever I feel has a better scope or better suited at this point of time. I'll take and go and revise. Now, people, use this as a base and take it further. So, will you upload this in marathon on YouTube later on, sir? I will log out now only. Yes, Macha. It will be uploaded, but it will take some time. But team has to do some edits, and they have some 101 dramas to be done. We will upload it. This is more than enough, sir. They're telling. Awesome, Macha. Thanks. Move on. Okay, this particular question. Let's see what this question is about. A company issues 15% convertible debentures. Stop. Did they say optionally convertible? Which concept? Stop. Tell me. Sir, if it's a convertible debentures, right? Here, see, with a maturity period of 6 years. That means it is irredeemable or redeemable? Redeemable. That means you will have RV. You will have one RV or two RVs. What are those two RVs? Redemption at cash option, redemption at share option. Right? If it is optionally convertible debentures, if it is optionally convertible means the company is telling the debenture holders, hey, macha, you're free to choose what? Either you can go for cash redemption option or equity redemption option. Did they say optionally convertible or they just said convertible debentures? If it is convertible debentures means this is what? Compulsorily convertible. For compulsorily convertible debentures, should we compare cash value and share value and take the higher of the two, or cash not even required? We'll only find out redemption value at what? Share value. And that only will be taken as what, sir? RV. That's all it is. Done, people? Okay. Face and this debentures carry how much interest rate? 15%. Face value of each debenture is how much? 100. Interest, dividend and all is always calculated on the face value. So calculate quickly calculate for me. Let's see. What is I? Interest rate is how much? 100 ka 15%, which is 50. Okay. At par. These debentures are issued at par. That means issue price is how much? 100. Okay. Face value is also 100. They're issued at par. Okay. Period of 6 years. I mean, these are what? Looks like a new debenture. We are issuing it now. Okay. And how much is the maturity period? 6 years. On maturity, each, pay attention to this. Each debenture will be converted into 2 equity shares. One debenture will get converted into 2 equity shares. On one debenture, you will give 2 equity shares. Okay. Of the company, you will give this 2 equity shares now or after 6 years? 6 years. Because debenture ka maturity period is 6 years. At the end of 6th year, what will happen is debenture holder will not get cash. Instead of cash, they will get equity shares. How many equity shares? For one debentures, 2 equity shares. Not me, question. Say yes. Okay. But keep in mind, you will get this equity shares only after 6 years. That is a highlight. Risk free, how much? 10%. Risk free is nothing but your RF. The moment that method comes, which is the only method which uses is Rasco, Pisco and all. CAPM. Tell me CAPM ka medal ka formula? RF plus beta into RM minus RF. RF we got it? 10%. Market risk premium. Risk premium means RM minus RF. That RM minus RF is directly given to be 18%. And beta is 1.25. Quickly calculate cost of equity for me. Quickly. 5 minutes. Not even 5 minutes, sir. 5 seconds. Cost of equity you find out using the CAPM model for me. I'll confirm with you the answer over here. I've already done. I'm smart. I didn't give. Okay. So cost of equity is RF is 10%. Correct? Okay. Plus beta is 1.25. Correct? No, you don't know the data. Huh? Papa, they're looking at it. Hey, show the data question once you show properly that telling. Okay. Take much. Risk-free rate of return is 10%. Market risk premium is 18%. Beta is 1.25. Over. Got everybody? How much are you getting? So RF given in the question 10%, which is 0.1 plus beta is 1.25. RM minus RF is directly given to be 18%. So that means cost of equity will be how much? 32.5. Got it? Okay, move on to the next part of the question. We have not solved it. We are just reviewing it. Now, okay, the company has paid the dividend. It has paid the dividend means D1 or D0? D0. How much is that D0? 12.76. That is also given. 5 years ago, it had paid a dividend of 10 rupees. Sir, current year, how much dividend we have already paid? 12.76. 5 years ago, how much dividend you had paid? 10. That means this dividend is same or dividend is changing. 5 years back it was 10. Now it has become 12.76. Means dividend is growing. Dividend is increasing. Meaning dividend is growing. That means in this problem, growth rate is missing or it is there. Growth rate is there. Correct? That growth rate, no sir, they have not given. We need to find. How to find? Simple, using trial and error method. In trial and error method, very simple. How it works is like this. Sir, how much was the dividend 5 years back? 5 years back, how much was the dividend? 10 rupees. Assume some random rate and figure it out. 5 years before it was 10. Now it has become how much? 12.76. We will have to test using trial and error method. Let's test with maybe 5%. So 5 rupees or 10 rupees was the dividend how many years back? 5 years back. Now I am testing whether growth rate is 5%. I am testing. It is not given. 5% is not given. I am just assume. So that means how many times I have to add this? 5 times. Correct? Because the 10 rupees is the dividend value 5 years back. So that means every year I'm thinking whether dividend is growing by 5%. So 10 you take and add 5% 5 times. 10 plus 5% plus 5% plus 5% plus 5% plus 5% you do, how much you getting? 12 point? Wow. Wow. Amazing. How much is it? 12.76. That means automatically you got it to be 12.76. That means indirectly what's our growth rate is 5%. This is your trial and error method. You need to take some random rate, 7%, 8% and test it. Okay. You'll have to do some multiple testing. That is your trial and error method. Okay, G. This is one method. No problem. Can I move on? Another way to calculate growth rate is B multiplied by R. B given. B is your retention ratio. Given? No. That means can we apply this method or not acceptable? In this problem, we can't apply because the data is missing. Another way to calculate is future value table. Another value is future value table. Sir, how much is the dividend now? 12.76. How much was the dividend 5 years before? 10. Current dividend, 12 point, take your calculator. Current dividend, how much? 12.76. How much was the dividend 5 years back? 10. So divide these two numbers. How much are you getting? 1.276 is what you're getting. Correct now? You took the dividend now, which is 12.76. You divided by dividend 5 years back. You got 12.276. Check the question. They have given you this future value table. This we call it as future value table. If they give you future value table, you can use this and get it as a growth rate. Okay. How? Very simple. What is the number you're looking for? You're looking for 1.276. Sir, how many years they've given? 5 years. Now come. This is your 5, 6. This is for 5 years. This is 6 years. This is 7 years. This is relevant for me or only 5 years? So that means I want this. I need to check in this table. In this future value table, I need to check because 5 years stands for years. 5 years stands for years. Okay, sir. Now, what is the answer I'm looking for? 1.276. Check which at 1%, how much is the value? 1.01. I have to look for a value 1.276. Where is that 1.276? At what rate? 5. That way, the growth rate is 5%. This is your finding growth rate using future value table. If they give you future value table, use this method. Otherwise, use trial and error method like that. Or if they give you B and R data, use B and R table. Whatever way, these are the 3 ways to find out growth rate. I hope all the 3 made sense to you. We've all done it as separate question in our regular class. Now I'll not have that, but I've discussed all the 3. That's okay with you? Can I move on to the next one? Okay, now check the other data. What is that? Oh, let's go further. Is there any flotation cost? Yes. Okay, one minute. Hang on. The company has paid a dividend of 12.76 and 5 years ago the dividend was 10 rupees. The flotation cost is 5% of the issue amount. Sir, is the company issuing equity shares or debentures? Debentures. Do not forget that. They have given this flotation cost next to equity shares, means that does not mean this is the flotation cost for equity shares. What instrument did the company issue? Debentures. But why did they give equity ka data? Because are you redeeming this debenture by paying cash or converting them? Converting them into equity shares. Okay, Saru? For that, they have given you some equity wala data. We'll see why they gave that. This flotation cost is not related to equity shares. It is related to debentures and it is 5% of the issue amount. Okay. Preference shares, it is this problem is only important for debentures. For preference shares, it is a normal question. I will not go into that. Only for debentures, there is one new thing that we can learn. So I am reviewing this question. Can I start? Now, what is this drama around this question is? This is a compulsorily convertible debentures. That means we need RV. We need a RV. RV of cash option or equity option. Equity option. Yes, sir. Correct. Sir, if you are giving equity shares means you need to know equity share ka price. Equity share ka price. Is equity share ka price for one equity shares, what is the market price given or missing? Missing. We have to find that first. For that, they have given some equity wala information. Done? So, we used the CAPM model and what did we find? We used CAPM model, we found out cost of equity. I will tell you one jugad, not jugad, you know this. Okay. Sir, they are talking about growth rate. Which is the only cost of equity ka formula which uses growth rate? Gordon's. Tell me Gordon ka formula. Cost of equity, how do you get? Either you can take D0 or you can take D1. Here they have given what, sir? They have given what? They have given dividend already paid. Dividend already paid means this is a D0. That means we'll construct the formula in a D0 way. So D0 into plus growth rate divided by P0. Okay. Flotation cost, Maraya don't do. Why? Sir, flotation cost is for equity shares or debentures? Debentures. Okay. So that means should have to minus F or not required? Not required. It is not there, so I'm not writing that. Okay. Plus what, sir? Growth rate. Yes. Everybody cool? Now you'll have to refine this formula a little bit. How? Sir, do you know cost of equity? Yes. How? You used CAPM model and you got cost of equity. Do you know D0? Yes. Do you know growth rate? We use future value table and growth rate to be 5%. Only thing you don't know is what, sir? P0. So we will use CAPM model to find out cost of equity. We will use Gordon's formula to find out price of equity shares. That's a combo wala question it is. Done, people? Everybody understood the approach? Now, if you know this means we just have to substitute. Okay. Now, how do you can rewrite this equation? To get P0, what I can do? P0 is equal to what, sir? P0 will go to that side. You want me to write the whole formula or is it okay? It's okay. That means P0, in fact, we have done this in dividend price model also. P0 is equal to what? D0 into 1 plus growth rate divided by A minus G. This will come here. This will go to that side and become the denominator. Yes, so people? If you want me to prove the whole equation, I can do it. I don't know whether I've written that here. In fact, I've written it here. Check. Okay, this is your cost of equity ka formula. Right? D0 into 1 plus growth rate divided by P0 plus the growth rate. Since flotation cost is not there, for equity shares, I've ignored it. Done? Now, this G comes to the other side. So, it will become what? K minus G. So, D0 into 1 plus growth rate divided by P0 is equal to K minus G. This will come to the other side. And this cost of equity will become the denominator. Hence, P0 is given by the formula D0 into 1 plus growth rate divided by K minus G. This is how you can find out this P0. P0 means current market price of equity shares. Do not forget that. Okay, sir. Done? Alright. Now, do you know D0? Yes, dividend paid currently is how much? We just know we got 12.76. Growth rate, we just now got it to be 5%. Cost of equity, we got it through CAPM model, how much? 32.5 minus growth rate you do, you'll get the current market price 48.72. Yes, G. Okay, G. Now, why do we need this? Because are we redeeming the debentures by paying cash or by getting equity shares? Equity shares. Yes. Okay. That means what is the value of one equity shares? 48.7. When you are converting debentures into equity shares, are you giving one equity shares or two equity shares? Each debenture they told in the question are convertible into two equity shares. Or don't be a Bruhaspati and do 48.72 into 2. Why? Sir, this P0 is a current market price. Are you converting the debentures today or after 6 years? Why 6 years? Because they told in the question the life of the debenture is 6 years. That means you want the price of the equity shares today or after 6 years? 6 years. This whatever you found out is current market price. We don't want current market price of the equity shares. We want equity shares ka value after 6 years. Because equity shares will not be issued now. It will be issued after 6 years. Okay. Now we already know the growth rate. How much is the growth rate? 5%. That means 48.72 is current market price. Means the shares will grow or increase by how much percentage? 5% every year. And we want the shares after 6 years. After 6 years. That means you will take 48.72. You will take 48.72 and add 5%. How many times? 6 times you add it. 48.72 plus, like I have done it over here. 48.72 plus 5% plus 5. Like this 6 times you add, how much you're going to get? 65.28%. Okay, sir. What is that 65.28%? That is the price. That is the price of the share after 6 years. That is the price of one equity shares after 6 years. Okay. Debentures will get one equity shares or two equity shares. The value of one equity shares is 65.28. The two equity shares ka value will be 130.56. That is your redemption value. Only this is the crux of this question. Rest everything is ditto. I'll give you a minute to just observe and quickly review and tell me. Any problem or comfortable? Okay, Ji. I'll tell you another way to calculate this also. We have used this in dividend discount model. Hence, I'll tell you. But so far, whatever we have done, is it okay with you? Just as a quick recap, what is it? These are convertible debentures. That means we need RV. We need RV of equity option. But equity share price given or missing? Missing. They gave you CAPM ka data. Using CAPM, what did we find? Cost of equity. Then they had given you Gordon ka some data. We used Gordon's ka data and we found P0. P0 is current market price of the equity shares. Are the debentures getting equity shares today or after 6 years? After 6 years. If the current market price is 48.62, means after 6 years, the share price will grow by 5% and it will become how much? 65.28. This is the 65.28 is a value of one equity shares. Will the debenture holders get one equity shares or two equity shares? Hence, multiply by 2, you will get the redemption value. This is one approach. Okay. Or another way you can reconstruct this formula. Sir, you know you can find out using D1 also. Tell me the formula using D1. P0 is equal to, instead of, if you do D0 into 1 plus growth rate, what are you going to get? D0 into 1 plus growth rate, if you do, you automatically going to get how much? D1. Correct? No? Yes. Divided by K minus G. Yes. Okay. Sir, if you want P0 means, you will take D1 divided by K minus G. Similarly, if you want P1 means, this is 0 means this is 1. This is 1 means this will be 2. So P1 is equal to D2 divided by K minus G. We want P1 or price of the share after 6 years. So if you want P6, you will take what? D1 or you will take D7? D7 divided by K minus G. Done, people? Okay, so you can do it like this also. That's another way to calculate it. Currently, how much dividend have you already paid? 12.76. Current dividend is D0. Current dividend is D0. We want dividend after 7 years. Dividend will grow every year by how much? 5%. We want 7th year ka dividend. That means you will add 5%. How many times? 7 times you will add. 12.76 you take and add 5% 7 times. What are you going to get? 17.956. Divided by K minus G, if you do, automatically you will get 65.28. Same answer. Whether you use using this model or that model, answer will be same. Whatever you are comfortable, do it. We have used this in dividend discount model, so I thought I'll tell this also. Okay. That's all with respect to this particular. In fact, okay, I think we can complete it off. So all this drama we are doing to find out cost of debt. This debenture ka life is 6 years. I mean, this is the redeemable debt. What is redeemable debt ka formula? Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Any problem in RV? No, we found no. Any problem in interest calculation? No. What about net proceeds? They only told that these debentures are issued at par. Face value is how much? 100. So that means what, sir? IP is 100. We don't want IP. We want net proceeds. Sir, whether you take IP, whether you take market value or you take face value, flotation cost we will ignore or minus. Do we have flotation cost in this problem? Yes, they told. How much is flotation cost? 5% of the issue amount. You issued the debentures for what value? You issued the debentures for 100. Flotation cost is 100 ka 5%. That means the net proceeds will become 95. Plug these numbers into formula and you will get the cost of debt. That's all it is. The whole crux of this particular problem is this particular working note. Remaining is just taking the data and dumping into the format and formula. Okay, Ji? Okay. So this is one more question I thought I should go ahead and explain to you. Hey, come down. One more concept is there. Quick thing. These are some shortcuts. I'll tell that. Then we can wind up this topic. Okay. Next one is one more question. This is tested is sometimes what happens now, sir? Check here. Debenture holders. In the market, the debenture ka market rate of interest is 12%. All our competitor companies are issuing the debentures at what rate? 12%. But we want to issue debentures at 9%. On our debentures, the company wants to give how much interest rate? 9%. But all our competitors are giving how much percentage? 12%. Now you tell me, you are an investor. You will invest in my company ka debenture or my competitor ka? Competitor. Because competitor is giving how much? 12% interest rate. I am only giving 9. So will you come to me? No. Okay. That means if I have to make the investor, the investor to buy my company ka debentures, what is the only way available for me? One, I have to increase my market interest rate. From 9, I have to make it as 12. But I don't want to change my interest rate. That means, let's say face value of the debenture is 100. Can I issue the debenture at 100 or I have to issue it at discount? I'll have to issue it at discount. Only way I can convince you to buy my company ka debenture is I can tell, boss, my company ka debenture is 100. But I will issue it at 90 rupees for you. Come. I will give you lower interest rate. I will give you lower rate. But the value of my company ka one debenture is 100, but you can buy it at just 90. That way you will get convinced. Yes or no? Because you are getting it at a lower price. That will compensate for the interest you are ready to sacrifice. Okay, sir. Now, when they give you these things in the problem, all this adjustment, they will give it to you. We have solved one question. Okay, and this, but I don't have time for that. So quickly, I'll discuss the adjustment. Now, market rate is how much again? 12%. Coupon, how much interest rate that we are actually giving is 9%. Face value of debenture is how much? 100. So when this scenario plays out or when this scenario comes, can I issue my debenture at face value or at discount? Discount. We have to find out what is the issue price. How to find it? Very simple. Sir, how do you find the interest on debentures? Don't look at the formula. You tell me. How do you find out the interest amount on debentures? You will take debenture ka value and multiply by the interest ka rate. Okay. Sir, if I give you interest amount and if I give you interest rate, can you find out debenture ka value for me? If I give you these two and if I ask you to find out debenture value, how will you find out? Debenture value is simply given by the formula interest amount divided by interest rate. Interest amount divided by interest rate. Same funda over here. Sir, how much interest am I actually giving to my debenture holder? 9%. Interest is always calculated on face value. So 100 ka 9% you do. How much is that? How much interest am I actually paying to my debenture holder? 9 rupees. On one debenture, I'm giving an interest of 9 rupees. Okay, this is your interest amount. Divided by what, sir? Interest rate. Interest rate, you should always take the expected interest rate. Divided by expected. How much actually I am giving? 9%. But how much is the expectation? 12%. So divided by 12%, you. How much are you getting? 75. That means I have to issue my debenture at 75. That's all it is. That's how you find out the issue price in this particular case. Or if you simply want it as a formula, interest amount divided by interest rate, expected interest rate. Interest amount divided by expected interest rate. If you do, you will get the debenture ka issue price. Okay. Sir, issue price is our net proceeds. No. From the issue price, we have to compulsorily minus the flotation cost. If it is there, then you will get the net proceeds. That is the adjustment of one of the question which I have just simply tried to explain as an adjustment. Understood? That's what I've written in the chart. Can I review the last one? Okay, one more problem specific. These are not concept. These are all some problem specific adjustment I've brought in. What is that is? Okay, let's take a simple example. Then I'll tell you the conclusion. Sir, let us say face value of the debenture is 100 and interest rate is 10%. So how much will be the interest amount? 10 rupees. Any problem? No. So redemption value, issue price and all are same. Issue price is also 100. Redemption price is also 100. And the life is 5 years. Tax rate is 30%. This is the data I have given it to you. So the moment N comes, these are what? Irredeemable debentures or redeemable? Redeemable. For redeemable debentures, what is the formula to get cost of debt? Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Interest, do you know? Yes. Tax rate, do you know? Yes. So plug RV. RV is how much? Redemption value and net proceeds. Both are same. Okay. If you plug in the number, how much are you getting? 7%. Any problem in the way of calculating this number? You don't have to calculate, but the way it looks like the numbers, you're completely comfortable. No issues. A plain, simple, vanilla wala problem. Correct. Now, sir, take your calculator. How much is the interest rate? How much is the interest rate? 10%. Just to do interest rate into 1 minus tax rate. Interest rate. Interest rate is how much? 10. 10 into 1 minus tax rate, you do. Tax rate is 30%. How much are you getting? Interest rate is 10% into 1 minus tax rate. If you do, automatically you will get how much? 7%. That means you tell me, you want to do this much drama or this is good? You want to do this much drama or this is good? If you just check the answer, here also 7, here also 7. That means indirectly what I'm trying to say. If RV, NP and all, if it is same, if RV is equal to NP, you don't have to solve it fully. You don't have to solve it fully. You simply take interest rate, not interest amount. You simply take interest rate multiply 1 minus tax rate, you do. A shortcut way to find out cost of debt. Shortcut will only work when what, sir? RV and NP and all are same. Otherwise, you'll have to do it in the normal way. Done, people? Sir, this shortcut only for cost of data, sir? No, the shortcut works also for KP also. For KP, will you take, first of all, what is the shortcut? Tell me, for cost of debt, what is the shortcut? Full you tell. Don't say interest. Interest rate into 1 minus tax rate. Same shortcut, can it work for preference shares also? Yes. For cost of preference shares, we will take what, sir? Preference dividend ka rate. Will you do 1 minus tax rate? No. That means what? That preference dividend ka percentage only will become cost of preference shares. If RV and NP are same. If you want, you can solve using full problem. You can solve. You'll get the same answer. But this is one quick fix to find out the answer quicker. That's all. Done, people. All right. Yeah, you can do this like this for descriptive question. Yes, that's the reason I'm telling. For bigger question, use shortcut method. It will save you 1 or 2 minutes extra time, which is very, very helpful in our examination. Sometimes even that 1 or 2 minutes only is a differentiating factor between 39 and 40. Because you think 1 minute, 2 minutes, if I add, no, I would have written 1 or 2 extra points. I would have got 1 or 2 extra marks. So time is very, very important as far as the CA exams are concerned. So do not compromise on the time. Don't worry about money. Okay. You can compromise on the money, but don't compromise on the time. Many students now I feel, sir, I only watch marathon class, sir, of yours, sir. Some other faculties I'll watch, sir. I'll do. I don't understand. Why, sir? Why so much of harkat for saving 4,000, 5,000 rupees? One class after all can cost how much, sir? 4,000 or 5,000 rupees. But if you lose one attempt, 4 months gone. Your salary is 80,000 per month minimum. 4 months gone means minimum 3 lakhs gone. To save 5,000, you are ready to risk 3 lakh. Personally, as an FM teacher as well as a normal student, I wouldn't be comfortable with that. Right? If you feel you have complete confidence in doing self-study, bindas do it. But if you feel, no, I will check that video from YouTube, this video from video, I'll collate and do. Why so much? Time is more important. Focus more towards that. Use your time to score a rank. From 8 lakh rupees, your package can go to 15 lakh also. Right? So just to save 6,000, I'm not saying this to market my course. I'm not asking you to buy my course. Buy anybody's. If you need help, take help. You should never compromise on that. Everybody needs help in some way or the other. All right? Even we also did not become like this. No, someone taught us only. We took help. Now I'm returning that favor by helping you guys. That's all it is. So wherever necessary, take help. All right. Whichever class. I'm not saying buy my class. If you have complete confidence, you'll do self-study. Bindas do it. But if it comes a point of time where you feel I'm struggling and you feel you're wasting time, stop there only. Go for it. Check 4 or 5 faculties ka video demo class. You check. Bye. Bindas. Okay. Take help always. Time is always important, people. Don't worry about 10,000. Whenever you get that, I know that sometimes that 10,000 can be costly affair. But for the save that 10,000, as I sold, 3 lakh rupees, you should not compromise. Because yes, your salary is going to be minimum 80 to 90,000 rupees per month. That much don't put it on. And I've also seen. So should I write 1 group or 2 groups? Measure time value of money. We are in FM concept. Whether you are ready to sacrifice 3 lakh rupees means take the attempt group wise. If you want that extra 3 lakh rupees means write both the groups like that. You should be willing to put efforts, people. Without efforts, nothing you'll get in life. Okay, at your stage, you should be willing to put that effort. So you should not say, I will only study 4 hours or 6 hours and all. No, I will study whatever the hell hours I need to complete the syllabus and revise the syllabus. I will write and I will clear my examination. Simple agenda. Don't overcomplicate. I see so many students are, I need that motivation video, this motivation video. They'll speak to 101 faculties. They'll speak to 101 friends. So what is your strategy, macha? What is their strategy, macha? Keep it very simple. Once you need to study, once you need to revise to clear the CA examination. That's how I have cracked. That's how many people have cracked. Okay. I've got a rank also with the same strategy. Okay. So rank, if you want, means you have to increase the number of times of revision. That's all. Is a rank holder different from a normal student? They're not that rank holder does not have extra horns or anything. Okay. It is just that the number of times they've revised is more. That's all you'll have to do. So focus more towards that and never compromise on the attitude, on the time. Keep this very, very straightforward. I will do whatever it takes. If today also when I asked you the session, I asked you, are you confident? Right? The answer I expected was yes, sir. Not even a second here and there you should think. You should say, yes, sir, I'm confident. That shows that you believe in yourself. that believe in yourself is a must, people. Whether I believe in you or not is a different issue. First of all, you should compulsorily believe in yourself. Only then the things will happen your way. Okay? And certain struggles, difficulties will come. And it's not easy. Now, even marathon, I've traveled. Yesterday, I couldn't sleep, to be honest. New place. Now, suddenly it'll take some time to get used to it. I slept only for 4 hours or something yesterday. But do you see me sweating? Do you see me? No, I have to take 7 hours class means I've already made up my mind. Today, macha, 7 hours class. Doesn't matter what the throat and all. After 3 hours, we'll start. After 3 days, I will not take class for the next 4-5 days because my throat will have some issues. Continuously speaking, 7 hours is not a joke, right? But I've made up my mind mentally. Yes, it has to be done. It needs to be done. So no second thoughts. The moment you have second thoughts, if I think, oh, yo, 7 hours, can I take it? Is it possible for me? Will these people understand? Will they like me? Will I be able to do justice? Because 130 hours ka content, I'm trying to do it in 13 hours. What if students think I'm a dumb guy? I don't know anything. Possible, no, sir? 130 hours ka content, I'm trying to deliver in 13 hours means it's a big task. All that negative feeling, if I start thinking, will I be able to do justice to my role? No. Simple agenda. I will do it. I'll do it. You will understand it. That's all. If I have to repeat it 10 times, I'll repeat it 10 times. If I have to take 10 hours class, I will take 10 hours. Come what may, we are sitting, we are learning, we are going. That's all as a simple agenda. When you simplify the things in your life like this, everything, whatever you are thinking will start manifesting in your life. But the moment that negativity comes, can I do it? My friend is so smart, he only didn't clear. I thought a dabba guy. Will I clear? My girlfriend, she's so smart too. She also flunked. Will I pass? Somebody passes, somebody fails. That is their drama. We are doing it, we will clear it. Keep the agenda very simple. Keep the dedication at the highest possible level. 10 hours, 12 hours, 14 hours, doesn't matter. We will sleep today here only, if required. But we will do it. That should be the attitude. Once you go into that, no sir, see Allah, nothing, everything will come to you in your life. That's all. Attitude, keep it very, very simple. Belief, absolutely I can. That's it. Nothing, no negativity. In the moment one negative thought comes, you say, shrug it off. I'll do it. That's all it is. Let people think that you have attitude. No problem. We will show our attitude once we clear our examination. Because people who bring you down, no, they only will say, hey, shabash macha later on. Yes, people who bring you down are the first people who will clap for you when your success comes. Yes, it has happened to me in my life also. I've shared so many of my stories. I mean, I'll not go too much into that, but just saying, right? So keep that attitude positive. That's all as a summary of this particular short session and this particular chapter. So with this cost of capital revision, we have completed. Thank you for your time and patience. With this capital structure. Okay. Now in the previous topic, we saw that each source of finance has a cost. How to find out that cost and all we saw. This particular topic scope is from what source of finance you should raise money. From what source of finance company should raise money so that the value of the firm is maximized. From what source company should raise the money so that the value of the firm becomes maximum. Okay, like if we need money. Okay, if you need 100 crore rupees means how much we should raise from equity shares, how much from preference shares, how much through debt. That is what we are trying to do in this particular topic. Okay, Saru? All right. Now, in this particular topic, there are some theories. All right. Theory as in few people have given their hypothesis or they have given their analysis. Those analyses are broadly classified into relevance theory and irrelevance theory. Relevance theory ka argument is debt is important. Debt is important. By taking debt, you can increase the value of the firm. By taking more and more debt, you can increase the value of the firm. That is a relevance theory ka argument. Irrelevance theory ka argument, name itself is saying irrelevant, like our classes. Absolutely irrelevant. Irrelevance theory ka argument is what nonsense. Debt has no impact on the value of the firm. Whether you take debt to or whether you don't take debt to, value of the firm will be constant. I mean, these are giving same views or opposite views. Opposite views. Okay. All right. We will see. We'll study them one by one. Okay. First, here, no sir. Just like last problem, we had some formulas. Here also there are around 5, maybe around 6 to 7 formulas will come. The questions will be revolving around those formulas. Okay. First, I'll tell you the formula. Then I'll dive into the theory. So now the overall essence of this topic is what? from which source of finance you should pick the money. Company should pick the money so that the value of the firm is maximum. Value of the firm is denoted by the symbol V, or sometimes it is also called as VF. V, or you can call it as V, below that VF. So here value of the firm is given by the formula EBIT divided by KO. EBIT divided by, EBIT stands for earnings before interest and tax, divided by KO. KO, you become experts. You know what is this? Overall cost of capital, also known as cutoff rate, also known as hurdle rate. Yes, all this, right? So EBIT upon KO, if you do, you will get the value of the firm. As simple as this. This is the first thing you need to remember. We had derived all this in the regular class. Now I will not go into the logic. Directly we'll go. If you remember this, that's good enough for examination. EBIT upon KO. Done, people? Or there is another way to get the value of the firm. That is S plus D. Value of the firm is denoted by the symbol V. V is equal to S plus D. S is market value of equity. S is market value of equity denoted by the symbol S. D is market value of debt. So usually in these sort of problems, either the company will raise the money through equity shares or debt. Preference shares company will not prefer generally. Companies don't prefer the preference shares. Why is? Now preference shares ka dividend rate changes or fixed usually. Preference dividend rate is same. Debt ka, loan ka interest rate is also fixed. Suppose if I give you in this question, it is a 10%. What happened here? Suppose I tell you that this preference shares is 10% preference shares and it is 10% debt. Okay. Which, as a finance manager, which one will you pick? Will you try to raise the money through 10% debt or 10% preference shares? You will always go for 10% debt. Why, sir? On debt, you'll have to pay interest. On interest, you will always get the tax benefit. Okay. But on preference shares, will you get tax benefit or no tax benefit? No tax benefit. That's the reason debt is a better plan compared to preference shares. Hence, in majority of our problems, we will only see equity shares and debt. We will not see of much of a preference shares. That is one. Okay, sir. Hence, value of the firm is given by the formula. What, sir? S plus D. S for market value of equity plus D for market value of debt. These are the two things you need to remember for the time being. Okay, G. One more formula is there. Sir, how do you get value of the firm again? EBIT divided by KO. Similarly, can you find out market value of equity for me? Market value of equity is denoted by the symbol S. Sir, is EBIT available for equity shareholders? You already know. From EBIT, if you reduce interest, what are you going to get? EBT. From EBT, if you reduce tax, EAT. Is EAT available for equity shareholders? No. From this, you have to reduce what? Preference dividend. Then only you will get what? Each. Also known as net income. This amount is available for whom? Equity shareholders. Yes or no? Correct? That means to find value of the firm V, we took in the numerator what? EBIT. Now we are trying to find out value of the firm or value of equity. Equity. For equity, should I take EBIT? Is EBIT available for equity shareholders or each? I mean, substitute the formula. Instead of EBIT divided by KO, S will be equal to what? Net income or each divided by, there it was KO. I'm trying to find out KO or market value of equity. Equity. That means instead of KO, you will substitute with what? Cost of equity. So if you do net income divided by cost of equity, you will get market value of equity. Okay. Market value of debt will be usually given to you in the problem. If they don't give, book value of debt and market value of debt will be assumed to be same in these cases. Yes, people. This one I've written something. Don't worry about this. This is an RTP question, or maybe I'll quickly tell. Instead of net income or each, you take retained earnings if equity dividend information is given in the question. This is the latest concept added in RTP May 25 question. We will do that a little later. Okay. Instead of net income, you take retained earnings. Sir, how will you get retained earnings? From net income, you'll have to reduce. From each, rather, you have to reduce equity dividend. If you reduce that, you will get what, sir? Retained earnings. So instead of each as a numerator, you will take what as a numerator? Retained earnings as the numerator if dividend, equity dividend information, if it is given to you in the question. Okay. I'll talk more about that when I do RTP question later on. For the time being, let it be there so far. Okay. This was not there in any of our previous question. This is the latest addition in RTP May 25 question. Okay, Saru. Okay. 3 components we have seen. Pakka, clear? Okay, quickly tell me again, what are the 3 formulas? Next question is plain application of that. Value of the firm is given by EBIT divided by KO, or value of the firm is given by S plus D. S is market value of equity, D is market value of debt. Market value of equity is denoted by the symbol S. It is given by, instead of EBIT, you will take each. Instead of KO, you will take cost of equity. Yes? Okay, now let's do a thing. Or maybe I'll, this is okay. Or this also, I'll explain it off, then we will apply it maybe. Now, sir, this particular KO and value of the firm now have ulta relationship. Meaning, if overall cost of capital increases means value of the firm will reduce. If overall cost of capital reduces means value of the firm will increase. Meaning it doesn't have a direct relationship. It has an inverse or indirect relationship or ulta relationship. If you want, we can prove it with numbers also. How do you get value of the firm? EBIT upon KO. Let's assume EBIT to be 90,000. Let's take KO to be 10%. Calculate the value of the firm for me. EBIT 90,000 divided by KO, which is 10% in full number if you take 0.1. So value of the firm will be 9 lakh. Okay, sir. I've just assumed random numbers. Now, instead of 10%, let's make KO to be 12%. Instead of 10, let's make it as 12%. Calculate value of the firm for me. EBIT is still 90,000. KO, instead of 10, I made it as 12. If you do that, how much are you getting? 7 lakh 50. What happened here? KO from 10, I made it to 12. So that means, what did I do? A cost of capital I increased. What happened to value of the firm? From 9 lakh, it became 7 lakh 50,000. So KO increases means value of the firm will reduce. That's what I'm talking about here. Okay, G. Alright. Now, maybe this particular portion, this section, I'll cover it off. Then we will take up one question. Now, as I said, theories are broadly classified into relevance theory and irrelevance theory. Relevance theory ka what is the argument? By using debt, value of the firm can be increased. The more and more debt you borrow, value of the firm will go on increasing. Okay, that is first. Under relevance theory, we have two people who are arguing for the relevance theory. First is net income approach. Under relevance theory, we have net income approach. What is net income approach ka argument is? Okay, stop. Sir, if you have equity shares, if you have debt, which is a cheaper source of finance? We have debentures and we have equity shares. Which is a cheaper source of finance? Debt is a cheaper source of finance because equity shareholders take more risk. If you take more risk, you will expect less return or more return. So cost of equity will always be greater than cost of debt. Correct, everybody? Now, this theory ka argument, net income approach ka argument is, since debt is a cheaper source of finance, use debt as much as possible. If you need fund means, company should always take the funds through debt. Take debt as much as possible. Because if you take more and more debt, since debt is a cheaper source of finance, overall cost of capital will reduce. If you take more and more debt, overall cost of capital will reduce. We just now know KO and value of the firm have same relationship or ulta. If KO reduces means value of the firm will increase. That is what this particular theory ka argument is. Okay, like just to be on the safer side, here just check. Let us say a company has raised 15% of their money through equity shares and let's take this. This is a cost of instrument actually. Cost of equity is 15%. Cost of debt is 10%. 90% of the money has come through equity shares. 10% of the money has come through debt. I've assumed. Hence, equity ka weightage is 0.9, debt ka weightage is 0.1. How do you calculate KO? Overall cost of capital, how do you calculate? Take that instrument ka cost, multiply by that instrument ka weight. If you multiply these two, how much you're going to get? 13.5. These two, if you multiply, how much you're going to get? 1. So overall cost of capital is how much? 14.5. So far, okay with this example? Just assume the numbers. Okay. Now, net income approachment ka argument is debt is a cheaper source of finance. Debt is a cheaper. The more and more cheap source of finance you take, overall cost of capital will reduce. Let's do a thing. Let's modify the weights. Equity ka cost is still 15%. Debt ka cost is still 10%. Instead of 90-10% money, let's make it 50-50. Meaning 50% of the money company will raise through equity shares. Balance 50% they will raise through debt. Assumption. Okay. In this case, what will be the KO? This is an assumption. In the first case, 90% money came through equity, 10% money came through debt was the assumption. Second case, 50-50 I made it. If you make it 50-50, how much is cost of that equity ka cost is 15%. Equity ka weightage 50%. This multiplying these two will get 7.5. These two ka multiplication will give you 5. So what is the overall cost of capital? 12.5. What happened, sir? KO, what happened? From 10% debt, you made the debt to be 50%. That means you took lesser debt or higher debt. You took higher debt. From 10% debt, you made it as, instead of 10% weightage, if you make it as 50%. What happened to overall cost of capital? Reduce. That is what this argument thinks. Since debt is a cheaper source of finance, more and more debt you take means overall cost of capital will reduce. Since overall cost of capital reduces, value of the firm will increase. This is the assumption. Okay, sir. Everybody cool? And this theory ka assumption is the cost of equity and cost of debt will always remain constant. No matter how much ever loan you borrow, how much ever debentures you issue, cost of the debt will be same. And equity shareholders ka expectation or cost of equity also will be same. That is the assumption this particular theory makes. Rational or not is a different issue, but that's the assumption. Relevant mostly for your 1 or 2 marks ka MCQ questions. Done, people? Now, another theory under relevance theory is a traditional approach. Traditional approach is a continuance. It is just an extension of the net income approach. What traditional approach is saying is, hey, net income approach, you are right only. You are right, but you did one mistake. You did one mistake. What mistake? Sir, this particular net income approach assumes that the cost of debt will be constant. Cost of debt will be constant. Sir, suppose I took 10 crore loan from bank. I took 10 crore loan from bank at, let's say, 10% interest rate. Okay, I took 10 crore loan from bank and bank charged me how much? 10%. Now I'm telling the banker I need 200 crore more loan. I need 200 crore. Okay, 10 crore loan I've already taken. I want to take additionally how much loan? 200 crore more loan. Now will the banker give me loan at 10%? Now, sir, this is a small or a big risk. Bank is taking a big risk. Sir, if banker is taking big risk means will they ready to give you the loan at 10% or they may give it to me at 12%? 12%. That means for 10 crore loan, how much was cost of debt? 10%. For 200 crore debt, the cost has become how much? 12%. Is the cost of debt same or it is changing? Changing. This method assumes what? The first method assumes that the cost of debt is constant. Traditional approach is saying, boss, cost of debt is not forever constant. It cannot be forever constant. Up to a certain level, cost of debt will be constant. Beyond that, if you borrow, risk will automatically increase and the debenture holders or the debt people will start expecting more. That is what this theoretical argument is all about. Okay, sir. That means this theory is saying don't borrow a debt left, right, center. Don't go on borrowing a debt. Take the debt only up to a certain level. In my example, up to what percentage the debt rate is fixed? Up to 10 crore cost of debt is how much, sir? 10%. If it goes beyond 10 crore means is a banker ready to give at 10% or it increased? Increased. That means the debt is constant only up to which amount in this case? 10 crore. So this particular theoretical argument is yes, debt is no doubt cheaper source of finance, but you take the debt only up to a certain level. Because beyond that level, if the company takes a debt beyond 10 crore, what will happen? Cost of debt from 10, it became 12. So the cost of debt will increase. Sir, now you think I'm the company. From 10 crore loan, my loan automatically became 200 crore. Equity shareholders will start feeling buku. Why? Sir, you have taken a huge loan. If your earnings is not there means, suppose I took a big building, Coimbatore, this building I purchased, thought 1,000 students will come. 1 student came. I took a loan and I purchased this building thinking 1,000 students will come my class. 1 student came. Now can I tell the banker, hey wait, next year 1,000 students will come, I will give you interest rate. What will the banker tell? Sell your building and give me my loan. That means automatically what happened? Risk, when you borrow debt, risk of the business increase. When the risk of the business increases, equity shareholders will be full chilled. They will also say, boss, you have increased my risk means my expectation also will increase. The moment you take debt, the moment you borrow more and more debt, cost of equity also will increase. If these two increases means overall cost also will increase. Automatically value of the firm will reduce. That is what this theoretical argument is. This theory agrees that debt is a cheaper source of finance, but you should take debt only up to a certain level, not beyond that. These are not much relevant for exam, only for theory MCQ question this may be relevant. So you don't have to break your head too much about all this. Yes, people, quickly 2 minutes may discussing. Done. Okay, now we will apply this particular or maybe one more I will do it off and then maybe go to the problem. This one I think also will be better. So far we discussed what? Irrelevance or relevance theory? Relevance theory. Now next we will move on to the next theory, which is irrelevance theory. In your house drilling is going on. Oh yeah, only in Bangalore branch drill is going on. Coimbatore branch is all done. Cool. Yeah, probably drilling and my marathon classes are synonymous, I guess. Last time when I took also drilling was going on. This time advanced accounting marathon also drilling was going on. Luckily Coimbatore doesn't. It doesn't happen there. Okay. All right. Irrelevance theory argument is debt is absolutely irrelevant for value of the firm. Whether you take the debt or you don't take the debt, value of the firm will be constant. That is what irrelevance theory argument is. Okay. Under irrelevance theory, there are again 2 more hypotheses or 2 more analogies. First one is net operating income approach, and another one is AMM approach, net operating income approach. This is what sort of theory, sir? Irrelevance theory. Irrelevance theory means debt is relevant or absolutely irrelevant. When you take the debt or you don't take the debt, value of the firm will be same. Why, or what is the thesis or synopsis of this particular theory is? Debt is no doubt cheap source of finance. Debt compared to equity, debt is cheaper. The moment you take a debt, what will happen to your overall cost of capital? Reduces. When KO reduces, immediately value of the firm will increase. Okay, first point, correct? Debt is a cheaper source of finance. Because of this, your overall cost of capital will reduce, which will cause the value of the firm to increase. But hang on, the moment you take risk, business risk is same or business risk increased? The moment you take risk, the moment you take a debt, equity shareholders will be chill or they will suddenly wake up. The moment you take a debt, risk of the business increase. The moment risk increases, equity shareholders will expect same return or higher return. The moment you take a debt, automatically, simultaneously, one more thing will happen where the cost of equity will increase. If cost of equity increases means, if one cost increases means overall cost also will increase. If KO increases means value will reduce. So this particular theory argument is due to cost of debt, KO first will reduce. And because of this cost of debt, cost of equity will increase and cost of equity also will increase. So these two will get set off. These two will get set off and value of the firm will remain constant. That is what this theoretical argument is all about. Okay, people. The takeaway of this particular example that you need to remember, which is relevant for examination, is this theoretical argument is this one. You tell me now. KO is there any change or no change? No change. First, it will reduce. Because of debt, KO will reduce. So immediately, because cost of equity increases, overall cost of capital again will increase. If this reduces by 5% means, and here also it will increase by how much? 5%. I mean, these two will there be any change in KO or no change? Overall cost of capital, and this particular theoretical assumption is the overall value and the KO will remain constant. And even for that matter, debt also will remain constant. Okay. So as per this theory, value of the firm, KO, KD, all this will remain constant. Only cost of equity will go on changing. And EBIT also will remain constant. This is irrelevant. We will apply this in one of the question. Just quickly review that. If you want any further explanation, we can take it or directly dive into the question. Comfortable? Huh? Yes? Okay. Synopsis of this theory, you tell me. This is what sort of theory? Irrelevance theory. Just the only examination related point. As per this theory, will there be any change in the KO or no change? KO will be constant. Value of the firm will change or same? Same. Okay. KD also will remain same. Only cost of equity will go on change. Because the moment you borrow debt, equity shareholders will expect higher return. So KO will remain same or change? Change. And EBIT also will remain constant. Earnings before interest and tax will change. It will remain constant. Why is this? Is simple. Sir, ArivuPro borrowed debt of 10 crore. From 10 students, 100 students will come to our classes. Huh? We did a marketing, we did a poster like this. Hey students, we have taken 10 crore loan. Please come to our classes. What will you say? Nonsense, people. Yes or no? If company takes loan means students will come. That means what? By taking the loan or not taking loan, this is what? EBIT. EBIT is what? In earnings before interest and tax. Is there any impact on EBIT due to debt? If I borrow more debt or if I borrow less debt, will my ArivuPro sales increase or reduce? It will be same. Correct or no? So that means this theoretical argument is EBIT under this option will be constant. Okay, because due to debt only interest will change. EBIT will remain constant. Okay, Saru. Let's apply this in one question first and then we will dive into other things. Here again there are only 5 to 6 at best concepts, but all are good concepts. So we will test them one by one, and if you do that, more or less this particular chapter should be revised. Okay, let's review this question. Alpha and Beta Limited are identical except for their capital structure. Maybe here in FMA, capital means equity share capital or it's capital employed. In FMA, whenever capital structure comes or capital comes, it means capital employed. Capital employed means equity share capital, reserves and surplus, preference share capital and long-term debt put together. All that only we call it as capital structure or capital employed. Okay. So these are same firms except they have a different capital structure. Alpha has 50% debt and 50% equity. Beta has only 20% debt and 80% from equity. Okay. All percentages are in market value terms. The borrowing rate for both companies is 8%. In a no tax world, so there is absolutely no tax. That means this is not in India, probably Habibi country. Capital market are assumed to be perfect. If you own 2%, if you own 2% shares of Alpha, determine your return. I mean, they're asking investors ka return. How much shares you own in that company? 2%. Your return they're asking. If the company has net operating income, so operating income only we call it as EBIT. Another name for EBIT is operating income. How much is operating income? 3,60,000. They have given operating income. We need to find investors ka return. Okay. And the overall capitalization of the company KO is 18%. Okay. Just now we learned, sir. They're talking about EBIT means this is talking about relevance or irrelevance theory. Irrelevance theory. That is your net operating income approach. Just now we studied, no? Just now we discussed hypothesis also. Under net operating approach irrelevance theory, KD will be constant. KO will be constant. Overall value of the firm will be constant. KE will change. EBIT also will remain constant. That means if this company has an EBIT, one company has EBIT of 360 means, if Alpha has EBIT of 360 means, Beta ko EBIT also will be same. Usually they will tell, even if they don't tell, that's a hypothesis or that's a conclusion of this method. So KO is 18%. Calculate implied rate of return on equity. Implied rate of return on equity is nothing but cost of equity. They're asking us to find out cost of equity through this. Okay, Ji. Now, whenever these sort of question comes, it's very simple. If you're getting lost, 3 formulas help you recollect to yourself. 3 formulas. What are those 3 formulas? Just now we learned. Value of the firm is given by EBIT divided by KO. Alright, then value of the firm is given by S plus D. Third one, value of equity is given by the formula net income or EISH divided by cost of equity. Okay. Now in this problem, first we will do it for Alpha. Sir, Alpha ka EBIT do you know? Yes. Alpha ka KO do you know? Yes. Using these 2 information, can you find out value of the firm? Okay, let's do that. How do you get quickly do it? How do you get value of the firm? EBIT is given, value of the firm is given by EBIT upon KO. EBIT is 360. KO is 18%. So if you do the value of the firm, how much is it? 20 lakhs. Any doubt? Done, G. Okay, this is one. Now, sir, if you read the question, have they told how much debt the companies have taken? Company has taken 5 lakh debt, 10 lakh debt, 20 lakh debt, like that have they given? Debt, interest rate on debt, you know. How much is the interest rate on debt? 8%. That is given. But debt ka value given or missing? Is it given specifically? No. But they told this. What is that? Alpha has 50% debt and 50% equity. Sir, what is the total value of Alpha? Just now we found. The total value of the Alpha is 20 lakh. And they only told in the problem that Alpha uses 50% equity and 50% debt. That means what is the market value of equity? This is a market value terms they told. No? So that means what? 20 ka 50% is equity. That means value of market value of equity is 10 lakh. What is market value of debt? 20 lakh ka 50%. This 50% I found or they told in the question. For Alpha, they told equity and debt ka percentage is 50 and 50. So market value of debt is how much? 10 lakh rupees. Till here, any problem? No. So did they ask this or what is the requirement of the question? They asked, you are an investor holding 2% equity shares. You are an investor holding 2% equity shares and they're asking your return. Sir, what is entitlement for equity shareholder? Does EBIT belong to equity shareholder or EISH? EISH. Correct? That means first they have given EBIT. First from EBIT we have to find EISH. How to find EBIT? How to find EISH from EBIT? You take EBIT given in the question, which is how much? 3,60,000 minus what? Interest. To calculate interest, we need to know the value of debt. Value of debt was not given. That's the reason we did the first 2 working notes. If they had given debt means I would have skipped these 2 working notes. Debt ka value was not given because to calculate interest, you need the value of debt. Now you know the value of debt? Yes. How much? How much is the value of debt? 10 lakh. What is the interest rate on debt they told in the question? 8%. So 10 lakh is the value of debt. 8% is the interest rate given in the question. So what is the interest? 80,000. Okay, sir. Okay. From EBIT, if you reduce interest, what are you going to get? Earnings before tax. Is there tax or no tax world they told? No tax. That means earnings before tax and earnings after tax will be same. Is there any preference shares or no information? If preference shares is not there means earnings after tax and each will be same. That's the reason directly I have written EBT, EAT and net income all are same in this problem to be how much? 2,80,000. Okay, G. Now this 280 belongs to whom? Equity shareholder. You are an investor holding 100% equity shares in the problem or 2%? 2%. So totally if you own 100% means you are entitled to get 280. You are owning only 2% means what is your return? Investors' ka return will be 280 ka 2%, which is how much? 5,600. That is a requirement to the first question. I hope till here all cool. Okay, this is one. First part ka first requirement they asked. And they also asked you to calculate cost of equity. Sir, we know one formula. Tell me, what is that formula? How do you find out market value of equity? S is equal to what? Each divided by cost of equity. This is the formula to find it. Sir, do you know each? Yeah, each is already known over here. How much is each, sir? 2 lakh 80,000. So each you know. Mark S you know. S is market value of equity. Do you know S? Yes, that is also you know. That means S also you know, each also you know. Can't you find out cost of equity? Substitute. How do you get cost of equity through this formula then? If S is equal to net income or each divided by K, means K will be equal to net income divided by S. Yes, no? Just a pure substitution. Correct. How much is net income? Or each, net income or each is 2 lakh 80,000 divided by market value of equity, which is S, we found out to be 10 lakh. Do this, you will get cost of equity to be 28%. This is one application of that formula. So far good. This is for what firm? Alpha. Now we read the question fully, or there's one more part? One more part. Now they asked beta has the same net operating income. Obviously we know if it's a net operating income approach, EBIT will change or EBIT constant. I mean this sentence they have to tell or not required. Even if they don't tell, we'll assume that the KO value of the firm and EBIT will be same in which way. So beta has the same net operating income. Will the KO of, what is the KO? In fact, they told, where is that here? What is the alpha ka KO? What is Alpha Limited ka overall cost of capital? 18%. So that means beta also will have how much KO? Because we know under net operating income approach, KO, value of the firm, EBIT all will be same. One firm ka if they give any of the data means other firm also will have same data. So let's find out. So beta ka, let's again say, maybe we'll read off the whole question. Beta has a has the same net operating income. You need to find out implied required equity return for beta. Beta ka cost of equity you need to find out. And you need to analyze why is it different from alpha. Alpha and beta ka cost of equity will not be same because net operating income approach is that only. What is that net operating income assumption? KO same, value of the firm same, EBIT same, cost of equity will change. So they are asking you analyze why cost of equity will change. First find cost of equity and give your thought process. Can we do it? Same step. You tell me the workaround now. You tell me the work steps. Okay. Do you know EBIT? Yes. Do you know KO? Yes. Using EBIT and KO, what you can find? Value of the firm. So let's find value of the firm. Will it change or same? Same. EBIT 360, KO, this means value of the firm will still be 20 lakh only. Same as alpha. Here also 20, here also 20 lakh. Okay, G. Alright. Next we can find out market value of equity and debt. Beta uses how much percentage debt and equity they told? Beta uses 20% debt and 80% equity. So total market value of beta is 20 lakh and beta uses only 20% debt now. So 20 lakh ka 20% is 4 lakh. And market value of equity for beta is 20 lakh ka 80%, which is 16 lakh. So that way we got market value of equity and market value of debt. Okay. Now we can find out each. Okay. How do you get each? EBIT, do you know? Yes. EBIT is how much? 3 lakh 60,000. From EBIT you have to reduce interest. Now don't take interest 80,000. This company has how much debt? 4 lakh. And the interest rate on debt is 8% as given in the question. So 4 lakh ka 8% will be how much? 32,000. Divided that if you do, you will get EBT. Since there is no tax rate and preference dividend here, EBT and each are same. We got this. Yes, people. Again, simply substitute. How do you get S? How do you get S? Instead of EBIT, you will take each. Instead of KO, you will substitute with cost of equity. Here, S you already know. S is how much? 16 lakh. Each you already know, which is how much? 3 lakh 28,000. Cost of equity they have asked. Substitute and get it. Therefore, cost of equity will be how much? 3 lakh 28,000 divided by 16 lakh. Divided by 16 lakh. If you do this number, how much are you going to get? My calculator showing, here I'm showing 20.5%. Okay, so cost of equity for beta is 20%. Check. For alpha, how much we got cost of equity? 28%. For beta, how much are we getting as cost of equity? 20.5. As per net operating income approach, cost of equity will same or it's constant or it will change. It will change. Obviously, these two are not same. Correct? No. Why is it changing? Obviously, because of debt. Because of debt. Sir, first firm is using how much a debt? First firm is using a debt of 10 lakh. Second firm is using a debt of 4 lakh. Now you tell me, which firm is more risky? This firm, this is alpha. Okay, alpha is using 10 lakh debt. Beta is using only 4 lakh debt. Debt is a risky affair. Because if you don't repay interest, what will the bank people do? Visualize. They'll keep quiet or they will sell your assets and recover. Sell your assets and recover. That means if a company borrows a debt, means it's a risky affair. This company has taken a debt of 10 lakh. This company has taken a debt of only 4 lakh. Which company is risky? Alpha is risky. Sir, if alpha is more risky, means equity shareholders will expect less return or more return. Since alpha ka risk is more, equity shareholders of alpha will expect more return. That's the reason if you just check, equity shareholders of beta are only expecting how much return? 20.5. For alpha, they're expecting how much? 28%. This is obviously more because the risk level has increased. That's all you need to write. Cost of equity of both the firm is differing because they are using same levels of debt or different levels? Different. Like that, 1 or 2 points you need to write and finish. That's all. Just for your comments. Only if they ask the comment, you comment. Otherwise, don't give your opinion. It's better to keep the things to yourself. Only if they say analyze or comment and all, garam masala you add. Otherwise, keep your garam masala to yourself. No need to give that story. This is one kind of problem that can be tested using the 3 equations. I'm not saying same will come, but using those 3 equations, they will construct the data. That is one type of problem. Can I move forward? Okay, next type of question is where? All right. Sir, we are discussing irrelevance theory. Under irrelevance theory, one we have already discussed. That is net operating income is over. Net operating income approach we have done. Next person who is suggesting irrelevance theory is MM approach. Modigliani-Miller approach. Modigliani-Miller approach, or popularly known as MM approach. Now, MM Saru is probably politician. He is batting on both the sides. He is favoring both the sides. Matlab MM approach is saying debt is relevant also. Debt is irrelevant also. That's what politician says. No? Yeah. MM sir is saying debt is relevant also. Debt is irrelevant also. So now sir, explain a little further, sir. MM sir is saying if there is no tax, no tax, stop. On debt, company will always get one extra benefit. What is that? Tax benefit. On debt, company will always get a tax benefit. If there is no tax, world only means? If there is no tax means, will you get tax benefit or goinda? Goinda. So, MM sir is saying if there is no tax means market value of the levered firm and market value of the unlevered firm will be same. Market value of the levered firm and market value of the unlevered firm will be same. Levered firm means that firm which is using debt. A firm which has taken a debt, we call it as levered firm. L-E-V-E-R-E-D, levered firm. That firm which has not taken debt, we call it as unlevered firm. If there is no tax means both the firms, the firm which is using debt and the firm which is not using debt, their market value will be same. That means is the debt relevant now? It becomes irrelevant. So if there is no tax means, MM sir is saying debt comes under irrelevance theory. Okay, people. However, and even this also, even the overall cost of capital of both the firms also will be same. Value of the firm also will be same, and KO of both the firm also will be same. When will it be same? When there is no tax, and there is no tax world. Okay, Ji. However, if there is tax means that firm which is taking debt, will they get same benefit or extra benefit? Extra benefit. So if there is a tax means market value of the levered firm. Levered firm means what, sir? That firm which is using debt. A firm which has taken debt, we call it as levered firm. Market, if there is tax means market value of the levered firm is given by market value of the unlevered firm plus levered firm will get extra benefit. What is that extra benefit? Tax. Take the market value of the unlevered firm and add the tax advantage or tax benefit. So how do you get tax advantage? Tax advantage you will get on what? Debt. So take the debt and multiply by the tax rate. You will get the tax advantage. Unlevered firm ka value you take, tax advantage or tax benefit you add, you will automatically get the market value of the levered firm. We'll apply this in one other question. Don't have to worry. Yes, people. Yes, G. Yes. Okay. One more thing is, sir, this is to find out the value of the firm. Value of the firm. Now, one more thing is, if they give you cost of equity of the unlevered firm in the question, if they give you cost of equity of the unlevered firm, using cost of equity of the unlevered firm, you can find cost of equity of the levered firm. Using unlevered firm ka cost of equity, you can find levered firm ka cost of equity. There's a formula for this. Both are same formulas, but just small differentiating factor. Okay. Now, what is this? Simple. If you want to find out, here you find out the value of the levered firm, no? Like the same way we can find out the cost of equity of the levered firm. Cost of equity of the levered firm is given by the formula. First listen, then we will apply it in one of the question. Cost of equity of the levered firm is given by the formula. Take the cost of equity of the unlevered firm. Unlevered firm means debt or no debt. Unlevered firm means they are taking debt or no debt. No debt. That firm which is not having any debt, we call it as unlevered firm. Here UL stands for unlevered firm. Take unlevered firm ka cost of equity. Okay. Plus cost of equity of the unlevered firm minus the cost of debt. Minus the cost of debt. Into debt into 1 minus tax rate divided by equity. This, in fact, it's not really a formula. It is just weighted average cost of capital ka application. I proved this equation to you in my regular class. How you get this equation. Now, that much time and all we don't have. And you also don't have so much of patience. Okay. All we want is tell what is relevant for exams. For examination, we'll only focus on the formula. We'll not worry about the derivations and all that stuff. So, should we have to remember this? Yes, this is important. Okay, of late, in a lot of RTPs and MTP questions, these sort of questions have turned up. So, this could be little important for the examination. So, again, tell me, how do you get cost of equity of the levered firm? Take the cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt into 1 minus tax rate divided by equity. E for here equity, that's all it is. Okay. Now, one point you need to keep in mind is here, though I've written KD. KD means what, sir? KD means don't look at me, da. Okay, KD is what? Cost of debt. Okay, cost of debt, we have already studied cost of debt. Yes, for cost of debt, we take before tax or after tax? Just now we did cost of capital. Did you take interest or after tax interest? So here, KD, no sir, here actually they should have modified, written the formula properly. It's not KD, it's actually interest rate. Don't take after tax cost of capital. Take only the interest rate. Why? Sir, what are you doing here? What are you doing here? 1 minus tax rate. 1 minus tax rate. Sir, when you do 1 minus tax rate, you automatically get what? After tax. Here also, if you do 1 minus t, then it will become multiplying 1 minus t 2 times. That's the reason don't take after tax interest. You always take what, sir? Interest rate here, because 1 minus tax rate is multiplied at the end over there. So, KD here is not after tax cost of capital. KD here is nothing but your interest rate. Okay, for your thought process, you can also remember the equation like this. If you want to find cost of equity of the levered firm, how do you get it? Cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus interest rate into what? Debt into 1 minus tax rate divided by equity. You will apply this formula when the tax exists, because only when the tax is there means you have to do 1 minus tax rate. If tax is not there means will the formula change? Yes. Is this 1 minus tax rate required or not required? Not required. Same formula cut and paste you do. Instead of that 1 minus tax rate is there, no, that is not required. If there is no tax, that's all. So if there is no tax given in the question, apply this equation. If tax is there means apply that particular equation. That's all it is. Yes, people. Can we go ahead and apply this in one of the question?
Yes.
Okay. We have solved about 3-4 questions using this equation in our regular class. One I'll take it now, just to be on the safer side. In question number 10, I think. Question number 10, we will review it. All these are from class notes and it's also available in ICA study material. Don't worry. I know that some of the people who watch this marathon will not be our students. So they will be completely new people also. So just to keep that benefit, I've taken questions as much as possible from study material so that you can refer to that and revise it also. Okay. Blue Limited is an all equity financed company. All equity financed means, are they currently having debt or no debt? No debt. That company which is not using debt, we call it as what? Levered or unlevered? So Blue Limited currently is an UL firm. UL means unlevered firm currently. Okay. Okay. It's an all equity financed company, but they are considering to repurchase 275 lakh equity shares and replace it with 15% debentures of the same amount. Till now, did they have debt or no debt? No debt. Now they are saying 2,75,000 equity shares we will buy back. We will cancel. And we will issue for this 275 lakh what? 15% debentures. Now after this exercise, company will still not have debt or they will have debt. That means they are going from what firm to what firm? They're going from unlevered firm to they're becoming levered firm. Yes. And what is the market value of debt? You already know. What is the market value of debt? 275. Okay. If in case of absence of information, book value and market value of debt will be taken as same. So how much is the debt they want to take it here? 275 lakhs. Okay. Current market value of the company is 175 lakhs. Stop. Sir, currently the company is levered firm or unlevered firm? Currently this firm is what? Currently this firm is an unlevered firm, right? Only after they buy back the equity shares and issue the debentures, they will become levered firm. So they have given current. The current market value of the company is 1750. So that means this is what, sir? Market value of the L firm or UL firm. So currently they have told market value of the unlevered firm, which is how much? 1750. Okay, that they have given. And its cost of capital is how much? 20%. Currently the company has what, sir? Currently company has only equity. That means what, sir? Your cost of equity and your overall cost of capital will be same, because you have only one source of finance, which is what? Equity. Correct? No? Correct, because 100% of the weightage has come through equity shares. That means the cost of equity and overall cost of capital currently is 20%. Is my statement right? Okay. Company's EBIT are expected to remain constant in future years. Fine. Company has a policy of distributing. That's okay. Assume that the corporate tax rate is how much? 30%. Tax rate is how much? 30%. You are required to calculate the impact on the following on account of change in capital structure. Now the company is doing some capital structure change. Equity shares they are buying back and replacing it with debt. So capital structure is changing. Due to that change, how your few things will get impacted, you need to tell. You need to find out market value of the company. Sir, given no, sir. Market value of the firm is 1750. No. This is the market value of the unlevered firm. Now we are unlevered firm or we become levered firm? Levered firm. That means they are asking you to find out market value of the levered firm over here. Yes, people, that is the first requirement. Then they're asking you to find out overall cost of capital, KO. Then they're asking you to find out cost of equity. Can we do it? First one is easy. You already know. Just now we learned two equations. Or before two equation, one more we learned. I told no. What is that? MM sir is batting for both relevance and irrelevance theory. If there is no tax, means levered firm ka and unlevered firm ka value will be same. Here there is no tax or we do have tax. We have tax. How much tax rate? We do have a tax rate of 30%. If there is the tax rate, do you know how to calculate? Yes, market value of the levered firm is given by market value of the unlevered firm plus a tax benefit. That is what they are asking to find. Can we do it quickly? Okay, look at it over here. Where it went, pa? Here. Market value of the levered firm is given by market value of the unlevered firm plus a tax benefit. Currently, what is the market value of the levered firm? Here only they gave. How much is that data? 1750 lakh. So market value of the levered firm currently is 1750 lakh. 1750. I've written that. Plus how much debt are they planning to take? 275. You need to take the market value of the levered firm and add the tax benefit. How do you get tax benefit? In fact, on what you will get tax benefit? Debenture interest. Interest you will pay 1 year or throughout? Throughout. Hence, instead of taking interest, we take the total debt value itself. What is the total debt they are planning to issue? 275 lakh. What is the tax rate given in the question? 30%. So the total tax benefit this firm will get is 82.5. So the market value of the levered firm will be 1832.5. Okay, G. Now it changed. Yes. Earlier it was how much? Market value was 1750. From 1750 now it has become 1832.5. It has changed. Yes. You need to call that. How much is the change in market value? From 1750 it has become 1832.5 means the change in market value is 82.5. That's what they're asking us to calculate. Fine. Okay. Second one they asked us to find out is KO and they also asked us to find out KE. Cost of equity. Just now we learned cost of equity ka two formulas. Tell me, what is the formula? If you know cost of equity of the levered, if you know cost of equity of the unlevered firm, can you find out cost of equity of the levered firm? Yes. Cost of equity of the levered firm is given with the formula. Take the cost of equity of the unlevered firm plus cost of equity minus interest rate. Okay. Into what? Into D. Into 1 minus tax rate divided by E. That's what we have to do, pure substitution. That's what I've written as formula over here. Okay. All right. Check here. Okay. I think for this information, one more we need, but anyway, we've started. So we'll go with this. Cost of equity of the unlevered firm plus cost of equity of the unlevered firm minus cost of debt. Here it's cost of debt or it's actually interest rate. This is interest rate into debt into 1 minus tax rate divided by equity. Why am I taking 1 minus tax rate here? Because tax is missing or given. How much? 30%. Okay, G. All right. How much is the cost of equity of the levered firm? Or how much is the cost of equity of the unlevered firm rather? Currently, they told. Currently, we are an unlevered firm. And unlevered firm ka overall cost of capital is how much they told? 20%. So currently, it's 100% equity. No, that means cost of equity and overall cost of capital currently is same. How much is that? 20%. So the cost of equity of the unlevered firm is given to be 20%. Plus, I've done it in percentage. If you want, you can do it in decimals. So this is 20 minus cost of debt. Here, this is cost of debt or interest rate? Interest rate. We just now read the problem. Interest rate on debt is 15%. So I've done minus 15. Okay, G. Into what, sir? Debt divided by, debt into 1 minus tax rate divided by equity. Debt is how much? 275. Into 1 minus tax rate is this. Divided by equity. Equity here stands for market value of equity. Market value of equity. Do you know that or missing? Do you know equity ka value or missing? Missing. That means before you put up this, we need to put up one more thing to find out S. S is nothing but market value of equity. So remember, we have three equations. Basic equation. What are those? Value of the firm is given by EBIT divided by KO. Useless to us. Leave that. Next, value of the firm is given by S plus D. We need S anyway. Do you know market value of the firm? Yeah, the market value of the firm is how much? 1832.5. Okay, this is value of the firm. S, do you know? Don't know. Debt, do you know? Yes. How much is the debt you are replacing with? 275. Debt, you know. Value of the firm, you know. Can't you find out S? Yes. S1, you just substitute. When you substitute 1832.5 minus 275, you'll get how much? 1557. This is your market value of equity denoted by the symbol S. That is your equity ka number here. Now, once more, clear. Paka. Everyone cool? So then work out this number. You will get the cost of equity of the levered firm to be 20.62. Before this change, cost of equity was how much? 20%. After this change, it has become 20.62. Obviously, no, sir. The moment you take debt, business becomes risky. After the business has become risky, equity shareholders will expect same return or higher return? Higher return. And from 20%, it has become 20.62. So it has increased by how much? 0.62. This is the third requirement of the question they have done. Everything just around that 4 to 5 formulas. So don't freak out. If you are stuck somewhere in your notebook, write down those 4 formulas and figure out how you can use those equations or formulas to find missing component. All this will be finding the missing components. That's all. If you get stuck also, no problem. You can leave the pages blank. Write one working note, leave around half a page and then start the second working note. That way you can fit in. Alright, are we done with the question or one more they asked? They also asked overall cost of capital. Overall cost of capital. This they have asked under approach. Okay, don't say this one operating income approach. Under operating income approach, KO and all will be same. Right? Here they have asked KO of the unlevered firm. Or rather, now it's a levered firm. KO, sir, we have to do it or you know it already? No. KO is nothing but overall cost of capital, no, sir. For that, we have this equation format. You know how to do that. How is it? Now we have one source of finance or two sources of finance. What are those? Debt and equity. Now weightage, you have to find out, you have to take weights. For weights, you can take book value or market value. Which is the preferred one? Market value. What is the market value of debt? 275. What is the market value of equity? Just now we found 1557.5. Okay, G. If you know these two means, can't you find out the weightage? Yes. How do you find out weightage of debt? 275 divided by 1832.5, which is 0.15. I've rounded it off. Okay. 1557 divided by 1832.5. If you do, it is 0.85. This is the weight of that instrument. How do you get KO? How do you get KO? Take that instrument ka weight multiplied by that instrument ka interest rate cost. Cost. Now don't say interest rate. I'll go only. Leave the class. Yeah. So you take that instrument ka weight and multiplied by that instrument ka cost. That instrument ka cost. Sir, hang on. Debenture ka interest rate. Debenture ka. I think I've solved it here. Debenture ka interest rate is how much? 15%. Debenture ka interest rate is 15%. Have they told these are redeemable debentures? We read the whole question. Have they given life? Have they given N? N is given or missing in that question? We read. N is not given means can you assume it as redeemable debt or irredeemable? Irredeemable. Yes, no. For irredeemable debt, how do you find out the cost of debt? Interest into 1 minus tax rate divided by net proceeds. Stop. Any information given or nothing? Nothing. I mean, should you have to work out or we can use shortcut? We can use, either you can do interest into 1 minus tax rate divided by net proceeds or you can use shortcut. What is that shortcut? Take the interest rate multiply by 1 minus tax rate. Automatically you'll get. Either you use your normal method or the shortcut method. Answer will be any which way. Same. Yes, people. Comfortable now? Okay. Alright. Now, how much is this cost of debt now? Interest rate is 15%, tax rate is 30%. If you do it, cost of debt will become 10.5%. Okay, G. You know the weightage of debt 0.15. After tax cost of debt is 10.5. So multiplying these two, you will get 1.58. Similarly, equity ka weightage is 0.85. What is the cost of equity of the levered firm? We just now found out. Cost of equity of the levered firm is here. Where is that? 20.62%. 20.62% is the cost of equity of the levered firm. and its weightage is 0.85. Multiply these two, you'll get the cost of equity. Adding these two, you'll get overall cost of capital. I think this I don't have to explain much. Simple, no? Same. KO finding out, the normal last chapter we did, no? Same thing. Done. If you don't want to put up table and all, you can present it in a little easier way. Is it okay? Can I share that? Yes. Sir, in this table, tell me what essentially are you doing? Do you need this number? Do you need this data? No. Do you need this data? Yeah, do we need this data? Yes, but only to find weights, right? That means essentially, do we need it? Not much required. It's so to get KO, only two things we need. What is that? We need weight of the instrument. We need a cost of the instrument. And these two, what do? Multiply. That is what I've done here. If you want to find out KO means, take the weightage of debt and multiply it by the cost of debt. Take the weightage of equity and multiply by the cost of equity. Essentially, we are doing in the table that only, So instead of wasting time putting the table, you solve like this. Okay, this is a shortcut, that's all. If you don't like all this, you can go for your normal table approach. That's the reason I've solved under both. You'll get the same answer. This is just some ways to save some time. Okay, how do you get weightage of debt? That also we don't need anything. How much is the debt, sir? What is the total value of debt? 275. What is the market value of the firm? 1832.5. Out of 1832.5, debt ka value is 275. Means what is the weightage? 275 divided by 1832.5. That's what we have done. If you do this, you'll get weightage of debt. This is the cost of debt. Now, people, similarly, market value of equity is how much? 1557. And what is the total market value of the firm? 1832. Out of 1832, equity has constituting 1557. So, what is market value of weightage of equity? 1557 divided by 1832.5. That's what I've done here. By doing this, you'll get the same cost of capital to be 19.190. Okay, Ji. How much changed? Earlier, how much was the overall cost of capital? 20%. Now it has become 19.09% because probably because of debt. On debt, you get a tax advantage. Because of the tax advantage from 20% overall cost of capital, it has become 19.09. So overall cost of capital has reduced. That's all. That you need to comment. Not comment, just put up like this. This is another question. Good question. Just that, see, all this, when I do it, you'll be like, later on, when you put it up, hands will not move frequently. Like, what the hell did that guy do? Something he came, something he told, something he left. But when we do it, our creativity will come into picture. So FM is a topic, if you want to gain confidence, only way possible is you have to solve. That I can't help. Okay. You need to practice as many questions as possible. If you don't have time, at least practice these sort of questions that we are doing over here. Okay. Ideally, I am not a big believer in skipping things. I keep endorsing that in my regular class if you are aware. Okay. I am a person who believes that everything should be learned, everything should be revised. Go and write. You have a good chance of clearing the examination. If you feel I have absolutely no time and all, then you can decide what you want to skip, how much and all. Fine. But I'll try my best to cover as much as possible. But don't blame me if these things and all don't come. So these are guesses. In this chapter, again, we have done more than 35 questions in our regular class. 30 or 35. I don't remember the exact number. All the 30, 35, can I revise it now? If I have to do that, I need 8 hours or 10 hours just for this topic. Then it will not become marathon. It will become a regular class. That is not our intention. So I will just pick up those things and we will do it. Okay, Saru. Cost of debt. Here. Done. Here, this is the cost of debt. Anything else you need? Hey, this and all is from regular class notes only. Same way I've done it there also. No? Maybe one or two I would have changed some presentation. Maybe this and all I would have not written or something. I don't know. Anyways, online, any reservations, any issues, or proceed, people? You have not written. No problem. Okay, this is cool. Now you will pick. I can't zoom in much here. Which working node you need? This particular portion. I'll quickly show you. Done now. Okay, awesome. This is done. Let me come back to the chart. People are saying enough, sir. Okay. Next is arbitrage. Arbitrage. What is this arbitrage? Same, under approach only, we have something called arbitrage. Okay. So this we have covered. Approach ka this portion and this portion we have done. There is one small concept called arbitrage. What is arbitrage? Sir, if there is no tax, as per sir, market value of the levered firm and unlevered firm will be different or same? If there is no tax, then the market value of the levered firm and market value of the unlevered firm should be same. Correct? That's what sir ka whole hypothesis is about. Suppose, okay, market value of the levered firm is 100 lakh. Unlevered firm ka value is 95 lakh and is a no tax scenario. It's a no tax scenario. There is no tax rate, but market value of the levered firm is how much? 100 lakh and unlevered firm is given to be 95 lakh. So ideally these two should be same. Is it same or it's not same? If it's not same, then you can do a process called arbitrage. So arbitrage will only come when these two ka value is not same. We don't have tax, but still these two ka value are not same. In this case, we can do something called arbitrage. Arbitrage means simply an activity done, an extra jugad, extra activity you are doing to get some gain. To get some extra gain, you are doing some activity. That only we are fancy name is given called arbitrage. Very simple. Now, sir, this firm ka, levered firm ka value. Levered firm means what again? Levered firm means that firm which is using debt. Unlevered firm means debt or no debt? No debt. A firm which is using debt called levered firm, their value is how much? 100. This ka value is how much? 95 lakh. Now you tell me which firm is overvalued. Which firm is overvalued? Ideally their value should be same. Is it same? No. Which firm is overvalued? Levered firm. Arbitrage ka process is very, very simple, or whole thesis or the background is very simple. Whichever firm is overvalued, sell that company ka shares. Sell that company ka shares and shift to that firm which is undervalued. Whichever firm is overvalued, sell that firm ka equity shares and buy which company ka shares? Undervalued company ka shares. Now you tell me, if you have to do arbitrage in this process, what will you do? Which firm is overvalued? Levered firm. Let's say you are an equity shareholder in levered firm. What will you do here? Since levered firm is overvalued, you will sell levered firm ka equity shares and buy what, sir? Unlevered firm ka equity shares. Okay. So here you are moving from what to what? From levered firm to unlevered firm you are moving. Okay. Why? Because levered firm is overvalued. Like that's all. It's a simple process. Why we do this is simple. Sir, if more and more people start selling company ka shares, what will happen? If more and more people, you have studied economics concept or not. Okay, if supply is greater than the demand, then what will happen to the price? Price will fall. If more and more people start selling the shares, means price will fall. From 100 lakh, if more and more people start selling, means from 100 lakh, its value will become 95 lakh. Okay, so till that time 100 lakh becomes 95 lakh, you can go on doing this arbitrage process and get some gain. That's all this process is all about. Okay, how to do it? I'll test. For in regular class, I'd given you, there are 4 arbitrage steps. For each, I'd given you steps and we had solved. Now I'll not have time for that. One I will take you through. Other 3 ka theory level I will explain. Okay, what you need to do. I don't know. Usually this scenario is what popularly comes in examination. Levered firm to unlevered firm. So this one case I will tell with some pointers. Okay, Ji. So you got the meaning of arbitrage, I believe, no? Those of you who are at least listening for the first time and all. Cool. Okay, how arbitrage works. So 1 minute, where is the question? One minute, let me find that question. We have 4 questions in study material on this. All the 4 we had solved. One I'll take it up now. Yeah, maybe this one I'll take it up. Yeah, 4 cases. All the 4 cases I will explain. One question I will solve. We are starting with a question only. Check much. There are 2 companies, N and M Limited, having the same EBIT. EBIT is how much for both the companies? 20,000. Okay. M is a levered firm having a debt. Obviously, levered firm means that firm will have debt. How much debt M Limited has? 1 lakh. And this debt carries how much interest rate? 7%. The cost of equity of N Limited is 10%. Okay, sir. M is a levered firm. Sir, if 1 is a levered firm means N is what now? If M is a levered firm means N is a unlevered firm. Unlevered firm means a debt or no debt? No debt. Okay. And what is the cost of equity they have given? 10%. For N it is 10%. For M it is 11.5%. This is the data they have given. You need to compute the arbitrage process on an assumption that investor owns 10% shares in levered firm. Currently an investor is owning shares in levered firm. Okay. And you know the arbitrage process. Whichever firm ka shares are overvalued, sell that and buy undervalued. Okay. Probably here we are going from L to UL mostly. We will see. Okay, Ji. Okay, sir, whatever be the process, in fact, under arbitrage, there are 4 cases. Whatever case they ask, first 3 steps are same. Whatever case, first 3 steps are same. First step is to find out value of both the firms. To find value of both the firms. How do you find out value of the firms? You know, V is given by EBIT upon KO. Have they given KO here or KE? They have given cost of equity. They have given cost of equity. All right. Now, second equation to find out value of the firm, which is what? S plus D. How do you find out S? How do you find out S? E divided by cost of equity. Sir, do you know cost of equity? Yes. If we can find out each, you can find out market value of equity. Market value of debt is already given. How much is that? 1 lakh. S plus D, if you do automatically, you will get value of the firm. That's the approach. Is it okay, sir? Now, EBIT. Now, to get S, what are the things we need again? Tell me that equation. S is equal to E divided by cost of equity. Cost of equity is given. All we need is what, sir? Each. Have they given each or have they given EBIT? They have given EBIT. First, from EBIT, we have to find out each. Tell me the order. How do you go about it? EBIT is how much, pa? 20,000. And the interest is what? 1 lakh debt. First, we will make a mental note of the note so that I don't have to come back to this page. EBIT is how much? 20,000. And how much debt this firm has? 1 lakh. And obviously, which firm has only debt? M. How much debt they have? 1 lakh. And interest rate is how much? 7%. So let's calculate. EBIT of both the firms are same. How much is that? Both the firms ka value you need to find out. EBIT for both the firms. M Limited is a levered firm. N is an unlevered firm. Levered firm means this firm has both debt and equity. Unlevered firm means it has only equity. This I have just written for your explanation. Okay. How much is EBIT given in the question? 20,000. 20,000. Easy. Okay. We need EBIT or we need each? Each. To get each, first we will reduce what? Interest. Which firm will have interest? N is an unlevered firm. Unlevered firm means is there any debt or no debt? No debt means will there be interest or no interest? No interest. M Limited is a levered firm. Will they have interest? Yes. How much is the value of debt? 1 lakh. What is the interest rate? 7%. So reduce it. You will get earnings before tax. Since there is no tax rate, earnings before tax, earnings after tax and net income are same. Because preference dividend is also not there. So how much is this? 13,000 and 20,000. Till you're cool? So you got your each. You got your each or net income. Do you know cost of equity? Yes, cost of equity of both the firms. They only given in the question 11.5 and 10%. This is given in the question. I did not find this. Okay. Yes, people. So how do you find S? How do you find S? Net income or each divided by cost of equity. So these two you divide. These two if you divide, you will get 113,043. These two if you divide, you will get 2 lakh. Is this the market value of the firm or market value of equity? This is market value of equity denoted by the symbol S. Done. We need market value of the firm. How do you get market value of the firm? S plus D. Take the D. Which firm will have D? Will N Limited have? N is an unlevered firm. Will they have debt? No. What about the levered firm? How much is their debt value? 1 lakh. Adding these two, you will get the value of the firm. So far, cool? Okay. Now check. There is no tax rate. There is no tax rate. That means the levered and unlevered firm ka value should ideally be same. Is it same or different? Different. If it is different, can we do arbitrage? Yes. What is the simple process of arbitrage? Whichever company is overvalued, sell it. Buy the undervalued firm ka share. Which is overvalued here? M Limited. Correct? M Limited, that is levered firm ka valuation is, it's overvalued. So you will sell M Limited ka share and buy N Limited ka share. That means you're going from levered firm to unlevered firm. That's the reason they gave in the question, you are an investor holding how much stake? They told in the question. Assume that an investor is owning 10% stake in the levered firm. So now you are moving from levered firm to unlevered firm. First step, I hope everyone is pakka. First, finding out market value of both the firms. Done, ji? Okay. Now, sir, arbitrage process is done by company or investor? Sir, arbitrage is a process done to get some gain. Will company bother about all this? No. Overvalue, undervalued and all, who will think about it? Invest. So, this arbitrage process is not done by the company. It is done by the investors. So, arbitrage process is always from the investor's viewpoint. Okay. Now, in this particular question, are we a 100% investor or 10%? 10%. In the question, they assume that an investor is owning only 10%. Okay. Now you are an equity investor. Listen to my sentence carefully. The next few part. It's a very simple things, but you need to know in what order you should proceed. As long as that clarity is there, calculation is nothing. Very, very straightforward. Okay. Sir, currently you are an equity investor in which company? M Limited. How much percentage stake you own? 10%. If you are an equity shareholder, means your entitlement is EBIT or EISH? Your entitlement is EBIT or EISH? EISH. What is the EISH of M Limited? The EISH of M Limited is 13,000. Sir, 13,000 is an entitlement for that equity shareholder who owns 100%. Do you own 100% or only 10%? 10%. That means what is your share? 13,000 is for 100%. For 10%, how much is it? 1,300 rupees is your existing return. This is okay. Currently, you are a shareholder in levered firm M Limited and your existing return is how much? 1,300. Is this part okay with everybody? Okay, now tell me once again, what are you doing in arbitrage over here? Whichever firm is overvalued, you are selling. And whichever firm is undervalued, you are buying. So currently, you are a shareholder in this company. Are you going to be a shareholder in this company now or sell it? Sell it. You're going to sell it, right? Now, when you sell it, will you sell it at book value or market value? You are a debt investor or equity investor? Equity investor. Do you know market value of equity? Yes. For the levered firm, what is the market value of equity? 1,13,043. Sir, 1,13,000 is a market value for 100%. As an investor, you are owning 100% or only 10%? 10%. That means by selling the shares, how much money you will recover? By selling this company ka shares, how much money you will recover? 113,043 is a value for 100%, but you own only 10%. How much will you recover? 11,304. By selling levered firm ka shares, you will get how much money? 11,304. Easy, people. Okay. Now, sir, excuse me, you are going from which firm to which firm? Levered firm to unlevered firm. Sir, through this arbitrage process, risk should not change. Risk should not change. It should remain the same. Okay, arbitrage is a process done to get some gain, but that doesn't mean that the risk level should change. Risk level should be maintained same. Now stop. What is it? Sir, levered firm means levered firm has a debt. Levered firm has debt. Sir, if levered firm has debt means I have invested in M Limited means as an investor also do I have debt risk? This M Limited has taken a debt. This company has taken a debt. Taking debt is what affair? Risky business. And I am an investor in M Limited. Currently, I am an investor in M Limited. That means, do I have debt risk on my head? As an equity investor, do I have debt risk? Yes. Since the company had taken debt, as an investor, I had also exposure to debt risk. I also had an exposure to debt risk. Now you are going from levered firm to unlevered firm. Unlevered firm has debt or no debt? That means the risk level same or changed. Sir, here you had debt risk. Here you have debt risk or no debt risk? No debt risk. Through arbitrage process, risk level should change or it should be same? It should be same. Here, did you have, as an equity investor, did you have exposure to debt risk? Yes. That means, can you reduce that, eliminate that, or you should still have? Even after arbitrage also, you should still have debt risk. You should still have debt risk. This point, everyone understood? Okay, sir. As an investor, okay, watch out once again. How much percentage stake currently are you holding? 10%. How much debt this firm had borrowed? This firm had how much debt? This firm had a debt of 1 lakh. Sir, 1 lakh is a debt for 100%. It's a 100% debt. You as an investor had 100% debt risk or only 10%? Since you were an investor holding only 10% equity, did you have 100% debt risk or only 10%? Calculate. 1 lakh or 10% is how much? 10,000. Can you escape that debt risk or you should still have? How to do that? Borrow the money. When you borrow the money, automatically you get debt risk. That means how much borrowing you'll make? You'll make 1 lakh borrowing? No. Earlier you had how much debt risk? Only 10%. So 1 lakh or 10% you calculate. How much is that? 10,000 rupees. So 10,000 is the amount you need to borrow. 10,000 is the amount you need to borrow. That means how much money you have? By selling equity shares, you got 11,304. With borrowings, how much did you get? 10,000. So totally now how much money you have, Kanda? 21,304. That much money you have. That much money you have. Now you are shifting to what firm to what firm? Levered firm to unlevered. Sir, how much stake you had in levered firm? 10%. Now do you like to change the stake or same stake? Same stake. If you had 10% equity stake in levered firm means after arbitrage also you will have how much? You will have 10% stake in unlevered firm. 1 second, hang on. sir, how much is the market value of the equity of the unlevered firm? Now you're going to unlevered firm, no? You'll buy unlevered firm ka equity shares. You'll buy unlevered firm ka equity shares. What is unlevered firm ka equity share ka value? 2 lakh. 2 lakh is for 10% or 100%? 100%. Are you planning to buy 100% shares in unlevered firm or 10% only? 10%. That means how much money you need? To buy 100% you need 2 lakh. Are we buying 100% or only 10%? That means how much money you need? Amount that you require for investment is only 2 lakh ka 10%, which is how much? 20,000. You need only how much? 20,000. But how much money is available with you? 21,304. Awesome. You need only how much? 20,000. How much you have? 20,000. That means how much extra cash you have. This is your surplus cash that you got it. Meaning this is the gain due to arbitrage. By doing this arbitrage, you will get some extra cash. How much extra cash? 21,304 minus 20,000, which is 1,304. Yes, people. Understood, everybody?
Yes.
This we call it as arbitrage through surplus cash approach. This is the arbitrage through surplus cash approach. There is also something called surplus earnings approach that we will say. Okay. Here we are doing what approach? Surplus cash approach. In surplus cash approach, your shareholding percentage and all will be same. In your levered firm, how much equity stake you had? 10%. In unlevered firm also, you will still buy how much? 10% only. But by doing this, you get some extra cash of how much is this? In this problem, extra cash is 1,304. Done, people? But there is one checkpoint here you need to do. Okay. This is what approach? Surplus cash approach. That means your earnings should change or same. Sir, earlier, how much was your return as an investor? What was your existing return? Before arbitrage, your existing return was 1,300. After arbitrage, this return should increase, decrease, or it should be same. Since you're following surplus cash approach, this return should decrease, increase, or it should be same. It should be same. Even after arbitrage, your return should still be 1,300. If it is not same, you have done something wrong. That's your checkpoint. Okay, sir. So let's find out. After arbitrage, what is the return for equity shareholder? And I'm an equity shareholder owning 100% or only 10%? 10%. Equity shareholders get a share in EBIT or EISH? EISH. Now I'm a shareholder in levered firm or I've shifted? I've shifted to which firm? Unlevered firm. What is unlevered firm ka EISH? EISH or net income for unlevered firm is how much? 20,000. Sir, how much percentage stake I own in unlevered firm? Earlier I used to own 10%. Now also I own how much? 10%. How much is EISH, sir? 20,000. 20,000 is EISH for 100% shareholding. I own 100% shareholding or only 20%? Or rather 10%. 20,000 ka 10% is how much? 2,000 rupees. I owe something wrong, sir. Go in there, sir. Wait. How much was your return before? 1,300. Now how much is the return? 2,000. Is it same or different? Different. But hang on. One more thing you need to consider. No. To do this arbitrage, you also took some borrowing. How much borrowing you took? 10,000. On the borrowings, if you take a loan, you will receive interest or pay interest? Pay interest. And they have already given in the question. What is the interest rate? Interest rate just now we found out somewhere also. No? Interest rate is how much? 7%. How much did you borrow? 10,000. How much interest rate you need to pay? 7%. So how much interest you need to pay? On your 10,000 borrowing, 7% interest if you pay, 700 rupees interest you need to pay. This is your return. This is your basically your expense something. So net of these two, how much is it? 1,300. How much was it before? 1,300. Even after arbitrage, how much is it? 1,300. Is there any changes in return or nil? This way arbitrage process works. That's all. This is your what, sir? Going from levered firm to unlevered firm using surplus cash. Now you got the funda. One I have solved. Other three theoretically I have written the points. Quickly I will review that. I have not written full points. Okay, for in regular class 8 to 10 points are given for all. Now I'll not go into that. Synopsis I'll quickly tell. Everybody cool? You want me to give you a recap of this arbitrage? Whatever we have done till now? Want it? Okay. So in this problem, what did we do? Basically, what is arbitrage? It's an activity done to get some extra gain. Okay. Here in this problem, the extra gain was surplus cash. Okay. So overall thesis or fundamental of arbitrage is what? Whichever firm is overvalued, sell it. And whichever firm is undervalued, buy it. That's all. Okay. That's the thesis. Okay. First three steps of arbitrage is same in every kinds of problem. Every arbitrage problem, first three steps same. First step is to find out value of the firm. For finding out value of the firm, either we need EBIT and we need KO. But in these sort of problem, they will not give KO. They will give you cost of equity. Using cost of equity, what you can find? S. How do you get S? Ish divided by cost of equity. So first find market value of equity. S. Market value of debt will be given to you in the question. S if you know, D if you know. Can you find out V? V is equal to how much? S plus D. That first you do. Okay. Find out the value of both the firms. That step I think comfortable with. Okay. Second you'll find out is what is now you are a shareholder in this company now. Are you still planning to be a shareholder in this company or sell it? Overvalued company ka shares you will sell. Will you sell it at book value or market value? Market value. When you sell, you will get money. That is what you need to first find. What is the market value of the equity in the levered firm? The total market value of equity is how much? 113,043. As an investor, you are owning 100% or only 10%? 10%. So by selling 10%, how much money you will get? 11,304. Okay, G. All right. Currently, you are a shareholder in which company? Levered firm. That means you should know current return. Return for equity shareholder is based on what? Ish. What is the ish of the levered firm? Ish of the levered firm is 13,000. 13,000 is for 100% shareholding. You own 100% or only 10%? 13,000 ka 10% is how much? 1,300. That is your existing return and this is your money by selling. Okay. But by doing arbitrage, risk level should change or it should be same? Same. Sir, earlier you were a shareholder in levered firm. Levered firm means, did levered firm have debt? Yes. Since you were holding shares in levered firm and levered firm had debt, you automatically had a debt risk on your head. How much is the debt of the levered firm? 1 lakh. 1 lakh is 100% debt risk. Do you have, as an investor, you have 100% debt risk or only 10%? 10%. I mean, by doing arbitrage, can you escape this risk or maintain this? Maintain. How do you maintain? Borrow the money. Borrow entire 1 lakh or only your share of risk? What is your share? 1 lakh ka 10%, which is how much? 10,000 rupees. That much you will borrow. By selling, you got this much. By borrowing, you got that much. So totally, how much money you have? 21,304. You will utilize this money to what? To buy the shares in the unlevered firm. To buy 100% shares in the unlevered firm, you need 2 lakh. Are you planning to buy 100% or only 10%? 10%. So 2 lakh ka 10% is how much? 20,000. You have 21,304, but you need only 20,000. So by this arbitrage process, you got an extra cash of how much? 1,304. That is the surplus cash approach ka arbitrage gain. Okay. Now in the surplus cash approach, will the shareholding percentage change? No. Will the return change or return should be same? Return also should be same. Now let's find out the return. Now you are a shareholder in which company? Unlevered firm. What is the ish of the unlevered firm? 20,000. How much shareholding percentage you have? 10%. So 20,000 ka 10% if you do, how much is it? 2,000 is your now the return in unlevered firm. That's all, or even you have borrowing. How much borrowing you took? 10,000. What is the interest rate you need to pay? 7%. This is your return, this is your cost. So net off you'll get how much? 1,300. Earlier also it was 1,300. After arbitrage also it is 1,300. Return remain same. Surplus cash. Okay, sir. That's all. This is the first case of arbitrage where we are moving from unlevered firm to, or you're moving from levered to unlevered firm under which approach? Surplus cash approach. Now another type of arbitrage. You're again moving from levered firm to unlevered firm. Levered to unlevered firm. But this time around surplus return approach. Surplus return approach. Surplus return means you want same return or higher return. Higher return. You want higher return. In this funda, very simple. In the previous problem, check here. How much money you had? Check everybody. How much money you had? 21,004. But how much did you invest? Only 20,000. Why? Because did you want to increase the shareholding percentage or maintain same? Maintain same. In surplus earnings approach. In surplus earnings approach, you don't want 10% stack. How much money you have? How much money you have? Whatever money you have, entire amount you invest. You don't keep any surplus cash. Whatever money you have, entire money you invest. Okay. That means how much money you have here? 21,304. Entire 21,304 you will invest. Okay. That means your shareholding percentage will remain same or it will change? It will change. Obviously. How much are you investing? If you do this approach, you are investing 21,304. And what is the market value of equity shares in the levered firm, sir? 2 lakh. To buy 100%, you need how much? To buy 100%, you need 2 lakh. Are you investing 2 lakh or only 21,304? For 100%, you need 2 lakh. For with 21% in 21,304 investment, how much stake can you buy? Can you tell me quickly this? 10.65%. I mean, you tell me. Earlier, you had how much percent stake in levered firm? 10%. Now, in unlevered firm, you will not have 10%. You will have 10.65%. That's all is surplus earnings approach. That's what I've written in points. Makes sense? Huh? That's what I've written here. Check. Invest the entire money in the unlevered firm. In our example, entire 21,304 you will invest and the shareholding percentage will become 10.65%. Obviously, if shareholding percentage increases means your return will be same or return will increase. Return will increase. Shareholding percentage and return will change. Basically, return will increase. That's the only step. Okay, that you need to do. One or two last steps will change. Otherwise, pretty much the same. This you can manage with theory. 4 problems are there in ICI material. You can use this as a base and solve it. If you need still my help, you can go for regular class. Not much time, not there for me. Okay, Saru. 2 is over. This is what? You moved from what to what? You went from, till now you went from unlevered firm to unlevered firm. Under surplus, cash approach. Under surplus, earnings. Now, ulta. You're going from unlevered firm to levered. What if unlevered firm is overvalued? That is also a possibility. Third and fourth case is that. Same. Unlevered firm to levered firm under surplus, cash approach. Then unlevered firm to levered firm under surplus, earnings approach. That's all. In this case, now what you have to do. Okay. Stop. Pay attention to this. Sir, currently you are a shareholder in which company? Unlevered firm. Unlevered firm means debt or no debt?
No debt.
No debt. Okay, stop. So currently as an investor, do we have exposure to debt risk or no debt risk?
No.
Since we are an investor in unlevered firm does not have any debt. That means we have debt risk or no debt risk?
No debt.
No debt. That means in this step, is borrowing required or no borrowings?
No borrowings.
That's the first step. In this type of arbitrage, borrowing is not required. Okay. Alright. Next, what you'll have to do is, okay, now you are going from unlevered firm to levered firm. But levered firm has debt too. Levered firm has a debt too. Unlevered firm had no debt, but levered firm has debt. When you shift, obviously risk level will be same or risk will change. This had no debt risk. This obviously has a debt risk. So risk level should change due to arbitrage or no change? No change. So hence, to cover this risk, what you do is you invest the money. Now you're going from which firm to which firm? Unlevered firm to levered firm. To cover the risk, what you'll do is you'll not only invest in equity of the levered firm, you'll also buy some debt of the levered firm. You'll invest the money in equity and debt over here to cover the risk, because levered firm has a debt risk. No? Levered firm has a debt risk. To cover that risk, what you do is you as an investor, you'll not only buy equity shares of the levered firm. You'll not only buy equity shares of the levered firm, you'll also invest in debt of the levered firm. Okay, when you invest in debt, what are you going to get? When you invest in debt, what are you going to get? You will get fluctuating return or fixed return? Fixed return. That way your debt risk will get mitigated. Is that okay with you? To maintain this risk, we particularly do this. So whatever amount you have now, you will invest in equity and you will invest in debt. Okay, sir, that's the first step. Now, same example we will take. Levered firm has how much debt? In our example, levered firm has how much debt? Levered firm has a debt of 1 lakh rupees. Assume that we are a shareholder owning 10% only. That means, should we have to buy entire 1 lakh money? Should we have to invest in a debt or only our share? Our share as an investor is how much? 10%. 1 lakh ka 10% is how much? 10,000. That means whatever money is available. Suppose we have 20,000 money available with us. Okay. Or maybe suppose we have 30,000 money available with us. Okay. In this 30,000, debt mein how much you will invest? 10,000 rupees. How 10,000? What is the total debt of the levered firm? 1 lakh. Do we want to cover 100% risk or only 10% risk? 10% risk. So out of this 30,000, 10,000 you will invest in debt. Okay, people? Yes. Now we are going from unlevered firm to levered firm using what approach? Surplus cash approach. In surplus cash approach, equity shareholding percentage and return percentage will change or no change? No change. So if you are holding 10% stake here, means in levered firm also you will own 10% only. That means suppose here. Equity ka market value, where's not going? Okay, equity ka market value, let's say is 1,50,000. 1 lakh ka 50,000. The total market value of equity in the levered firm, I've assumed it to be 1 lakh ka 50,000. Are you going to buy entire 1,50,000 or only 10%? 10%. Why 10%? Why 10%? Tell me once again. Because currently you are owning how many shares in unlevered firm? 10%. After arbitrage also you will own 10%. Why? Because are we following surplus earnings approach or surplus cash approach? Cash. That means how much you need for investment. The market value of equity of the levered firm is 1,50,000. Do you want only 10% stake in this? So how much money you want, sir? As an investor, how much money you will spend? You will spend only 15,000. So you have 30,000. In 30,000, 10,000 you invested in debt. 15,000 you invested in equity. Still, how much extra cash you have? In 30, I said 10 gone for debt, 15 gone for equity, means 5 is still remaining. That is your surplus cash approach. That's all it is. Okay, sir. This is the pointers. Once again, can we review this? So we are doing what to what here? Don't look at the board. I mean, that point, just like that. You're going from unlevered firm to levered firm. But under which approach? We are doing under surplus cash approach. Unlevered firm means, do they have debt or no debt? No debt. That means under this type of arbitrage, is borrowing required or no borrowings? No borrowings required. So first check how much amount is available for investment. How much amount is available for investment? That you will get it from step number 2. That's what I told you. Step number 1, 2, 3 in all the arbitrage processes, same. Do it then. Then onwards, you need to check. So, is borrowings required here or no borrowings? No borrowings is required. That is one. Second one. Now you are going from unlevered firm to levered firm. Levered firm has equity also. It has debt also. If levered firm has debt, means automatically you get exposure to debt risk. Earlier you had debt risk or no debt risk. But now you automatically get debt risk. So to cover this risk, what do? We invest. We invest not only in equity of the levered firm, we also invest in debt of the levered firm. How much? Our share. What is our share? 10%. So 10% of the debt, 10% of the equity we will buy. And we'll end up getting some surplus cash. That's all this is approach all about. Okay, Ji? And obviously, in this approach, surplus cash approach, will the equity shareholding percentage change? No. Will the return change? No. That's all. Clear? Sir, how to find out which approach to use in exam? Sir, they will mention. If they don't mention, your choice. Either you can solve under surplus cash approach or surplus earnings approach, your call. Ideally, they should mention. Okay, now fourth case of arbitrage, you tell me what is it again? Unlevered firm to levered firm. But now under surplus earnings approach. That means you want same return or more return. If you want to earn more return, means will you have same equity shareholding percentage or more? Okay, same step. You're going from unlevered firm to levered firm. Unlevered firm has debt or no debt? That means did you as an investor have debt risk here or no debt risk? But levered firm has debt. That means automatically you get exposure to debt risk. So what you will do here? You will invest only in equity shares or you will also invest in debt? When you're going from in this approach, first of all, is there any borrowings required or no borrowings? No borrowings is required. You have to invest the money. You will invest only in equity or also in debt? You will invest in equity also, you will invest in debt also. Do you want surplus cash or you will invest entire money? Entire money you will invest in equity and debt. Sir, in what ratio? In equity is to debt ratio. Equity and debt of the levered firm will be there. Now, suppose equity of the levered firm is 1 lakh. Debt of the levered firm is also 1 lakh. What is the ratio? 1 lakh is to 1 lakh or 1 is to 1. So, in 1 is to 1 ratio, whatever amount you have, you will entirely invest. In these sort of problems, usually debt equity ratio will be same. In these sort of problems, debt equity ratio will be same. That means equal amount you will invest in equity as well as debt. Okay, people. Now your shareholding percentage will be same or it will change. Shareholding percentage will change. Return also will change. That's all it is. This is your another approach of arbitrage. You can use this as a base and take a few more questions. Okay, G. That is all, G. Online also cool. Sir, over, sir. Yeah. Not over, but yeah, almost over. This is over. Okay. Sir, 2 more concepts and we are done. 2 more concepts and 2 more questions and we are done. This chapter, not class. This topic is over. Then we will take sapado break, come back and next topic. That is a shorter version. After lunch, I know that... yeah, so I have taken a shorter topic. Okay, these 2 are little bigger ones, so we will review this. Okay, next concept is pecking order theory. Pecking order theory ka funda is, now again go back. What is this chapter ka whole thesis or whole basis, sir? From which source of finance you should select the money so that the value of the firm is maximum. That's the overall goal. The goal here is to maximize the value of the firm. Okay, what pecking order theory, one more theory says is, what it says is different people in the organization have access to different sets of information. Different people in the organization have access to different sets of information. Like here, you are studying with us. That means you know a few information about ArivuPro. Correct, no? Where we are, who teaches. Correct, no? That guy is good, that guy is bad, that guy is Sandesh sir to literally waste only. Like that and all, you'll know a few information. Correct, no? Right, that. Similarly, I will also know some information about ArivuPro. Now, you will know more information about ArivuPro or I will know? I will know. Correct, no? Why? compared to you, I'm at a little better position now also, figuratively, relatively correct. Yes, no, because I am probably teaching at ArivuPro, I'm working at ArivuPro, I will have little more information. Pecking order theory says that only. Different people in the organization have access to different levels of information. A lower level employee will have one information, means a managing director will have same information or more information. More information. This theory says that whichever source of finance gives you maximum information, whichever source gives you maximum information, raise the money from that source. Raise the money from that source. As per pecking order theory, first priority you should always, whenever you want money, if you want money for expansion, diversification or whatever, whenever you want money, first you will try to pick it from retained earnings. First you will try to pick it from retained earnings. Why? So retained earnings, are you issuing any extra instrument or you're using your existing money? Using your existing money, do you know any information is missing or you know full information? You know full information about retained earnings. Since you know maximum information about retained earnings, first priority to retained earnings. Whenever you need money, first pick the money from retained earnings. Okay, if you have shortage or if you don't have retained earnings, next priority you will give it to debt. Provided earnings outlook is positive, meaning if in future, if you're planning to earn more, then only look to borrow the debt. So second priority, you will give it to debt. Last priority, you will give it to new equity. New equity shares, you will give it as our last priority because equity shareholders are crazy people because their expectations will be same or will go on changing. That means with respect to new equity shares, we will have full information or no? No. With respect to new equity shares, we'll have the lowest level of information. Hence, the last priority for equity. That's all it is. Again, just remember this in case MCQ question turns up. Not practical, just a theory standard. Okay, G, this is not required. Leave. This is important. Financial break-even point. FBP. Financial break-even point. Break-even point. Costing is already over. Luckily, I came after Rashid sir. So good for me. Right? Break-even point means what? No profit, no loss. Financial break-even point means what should be your EBIT? What should be your EBIT so that your EPS becomes 0? What should be your EBIT? You have to find that EBIT which will generate how much EPS? 0 EPS. EBIT will not be given. You need to find out EBIT. What should be the EBIT so that at that EBIT level your EPS will become 0. That only we call it as financial break-even point. Okay, Zaru? Alright, so what is this financial break-even point? It's a one-liner answer. If you have only equity shares, meaning suppose you need a 10 lakh rupees money, you need a 10 lakh rupees money and entire money you raise through only equity shares. If you have 100% equity, if you have raised 100% of the money from equity shares, means financial break-even point is only if your EBIT is 0. Only if your EBIT is 0, your EPS will become 0. So financial break-even point for 100% equity plan is EBIT should be equal to 0. Only if EBIT is 0, only then EPS will become 0. I proved all this with numbers in our regular class. I will not go into that. Alright, no logic now. Now it's only magic formula. Okay, pointers. Okay, if you want explanation detailed and all, a regular class. Now I will not go into that because to prove it I need another 10-15 minutes. Rather I can use that 10-15 minutes to do 1 or 2 extra question which is more exam worthy. Okay, but right now we don't. What will you do with deriving the logic? Correct? No. Any which way they will not ask you explain this formula. They will say solve this question. How you solve? Absolutely your call. Okay. So for 100% equity plan, if you want your EPS to become 0 means EBIT should become compulsorily 0. That is one. If you have 100% debt plan, meaning suppose you need 10 lakh rupees money and entire 10 lakh came through what? Debt. Entire money you have raised through debt. 100% of the money if it has come through debt means in such a case, my financial break-even point is your EBIT should be equal to interest charges. Your EBIT, if your EBIT and interest charges, if it is same, only then your EPS will become 0. So financial break-even point for this is EBIT should be equal to interest charges. If you have only preference shares plan, 100% of the money if it has come through preference shares. In that case, my financial break-even point is given by the formula preference dividend divided by 1 minus tax rate. Do this, you will get a particular number. That number should be EBIT. If that, suppose you got this, calculated this and got it to be 10,000 means, that means if your EBIT is 10,000 here, only then your EPS will become 0. Okay. I'll not go into, I've told you why and all this is so, but you need to remember this for your examination. Okay, sir. But keep this in mind. This is all for what, sir? 100%, 100% and 100%. Now, if company wants any funds, 100% of the money, do they raise it from one source or they will use multiple sources? Suppose all the three are there, means company has equity shares also, company has preference shares also, company has debentures also. In that case, what is FBP? In that case, for equity shares, financial break-even point is in each way 0. Cut that. Other two is what? What is a debt ka financial break-even point? Interest charges. For preference shares, what is the FBP? Preference dividend divided by 1 minus tax rate. Add these two. So if all the instruments are there, means financial break-even point is given by interest charges plus preference dividend divided by 1 minus tax rate. You do this. Suppose you got this to be 2 lakh. That means what? If your EBIT is 2 lakh, only then your EPS will become 0. A shortcut to find out when EPS will become 0. That is your financial break-even point. Break-even point means no profit, no loss. No profit, no loss means obviously it should be 0. That's all it is. Okay, Ji. We'll apply this in one question. One more concept is there. First, I will do that. Can I dive into the next question, everyone? Online also, everything going good so far? Okay, thank you. Okay, moving along. Okay, next is something called indifference point. Indifference means it doesn't make a difference. Like our teaching. My teaching, will it make any difference to you? No. Before attending class also, same knowledge. After attending class also, same knowledge. Just no. That is what we mean by indifference point. Indifference point means what should be your EBIT? What should be your EBIT that both the plan will give you same EPS. Both the plans will give you same EPS. Like to give you an example, suppose I need 10 lakh rupees funds. A company needs a funding of 10 lakh. They have two options. One, entire 10 lakh they can raise by issuing equity shares. They can issue new equity shares for how much? 10 lakh. 100% of the money will come through equity shares. Second plan is 50% you raise from equity, 50% you raise through debt. So in first plan it is 100% equity, second plan 50-50. What indifference point is trying to calculate is what should be the EBIT so that both the plans are same or different. What should be your EBIT so that when you calculate EPS under plan 1 and EPS under plan 2, both will give you same EPS. Financial break-even point will lead to 0 EPS. Indifference point will give you same EPS. That's a distinction. Okay. Here again, we need to find out what is EBIT. At what level of EBIT both the plans will give you same EPS. This is given by the formula. What is that formula? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. Okay. It's the same EPS, no? When you're talking about same EPS, are you comparing just one plan or you're comparing two plans? You're comparing two plans and saying they're same. So this is EPS under plan number 1. This has to be different or it has to be equal. It has to be equal with EPS under plan number 2. So it should be equal to EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. So you find out this. Okay, all the numbers here will be given. Only EBIT here will be missing. EBIT will be missing. When you solve this equation, you will get EBIT. That is your indifference point ka EBIT. So what is this equation, sir? Simple. This is EPS ka formula. EPS ka formula. How do you get EPS is earnings per share. How do you get EPS? EPS today. EPS means earnings per share. Share, we are talking about equity shareholders. Whenever you get confused, think, is EBIT available for equity shareholders? What is available for equity shareholders? Each. That means EPS ka formula is each or net income divided by number of equity shares. By doing this, this is just expressing the formula in words. Okay, just simple. Check if you want. I've just written some numbers. First part we will take. From EBIT, you will reduce. Here EBIT. I1 means interest. Here we have one plan or two plan? Two plan. I1 means interest under plan 1. From EBIT, if you reduce interest, what are you going to get? From EBIT, if you reduce interest, what are you going to get? Earnings before tax. That means by doing first equation, first part, you will get what, sir? Earnings before tax. From earnings before tax, we need earnings before tax for EPS or we need each? Currently, we are at earnings before tax. We need what, sir? From EBT, directly you can jump to EAT. From EBT, you can directly jump to EAT. How? One way is reduce the tax rate. One way is to reduce the tax rate. Another way is, let's say tax rate is 30%. Let's say tax rate is 30%. You do EBT into 1 minus tax rate. You do EBT into 1 minus tax rate. Calculate this for me. How much is EBT? 90,000. Tax rate is how much? 30%. So do that. 63,000. I mean, this formula is automatically giving you what? By doing this automatically, what you will get? Earnings after tax. Yes, people, when you do 1 minus tax rate in FMA, whenever you do 1 minus tax rate, it is always after tax. To get a number on an after tax basis, to get any number on an after tax basis, we always multiply 1 minus tax rate. From EBT, if you multiply 1 minus tax rate, you automatically get what? EAT. Yes, people, that is what here we have done here. Understood, everybody? Okay, come back again. From EBIT, if you reduce I1, that is interest, what are you going to get? Earnings before tax. From earnings before tax, if you multiply 1 minus tax rate, what are you going to get? By multiplying these two, you get earnings after tax. We need earnings after tax for EPS calculation or EASH. From earnings after tax, what do you do? Reduce preference dividends. So that means the numerator is nothing but your EASH. Expressed in what? Wordings. That's all it is. Divided by E1. E1 means number of equity shares in plan number 1. That's all. So EASH divided by number of equity shares will give you EPS. Under indifference point, both the plans should have different EPS or same EPS. Under indifference point, different plans will have different EPS or same EPS. Same. Hence, we have equated. Okay. Now, this is EPS for plan 1. Now, we have to calculate again EPS for plan 2. Now, you tell me in words. Let me see the formula. Now, don't tell me EASH. One way to calculate EPS is EASH divided by number of equity shares. Tell me fancy formula. Start with EBIT. EBIT minus, don't say interest. Tell me the exact formula. EBIT minus I2. Okay. Into 1 minus tax rate. Minus preference dividend. By doing that, you will get EASH divided by E2. This plan 2. E2 means number of equity shares under plan 2. Equate this. In this way, everything will be given except EBIT. All other data will be available except EBIT. Solve this equation and get EBIT. That is your indifference point ka EBIT. Okay, people. That's all is this. This one, I'll talk about it in a bit. This one also probably I'll talk about it in a bit. First, we will calculate one or two. One question we will take and then we'll come to that. Blue over. And remind me, maybe this one question based on availability of time, we will take it. This one we will maybe take up just to have a concept of FBP and indifference point clear. Okay, check this. This is our Ganapati problem. Study material question only. As much as possible, I've considered study material question, and I have told after the whole recap is over, RTP and MTP we will do for this attempt. And that we will do it at the end. So that again, once again, all the concepts we can revise. That's the reason I'm not doing it now. If I do it now, it's actually easy for me because I don't have to tell the concept again. You already remember the concept, but I want to know how much attention you paid in this marathon. So after 2 days, I'll again ask you what are those formulas again so that it can become a recap for you. Just I thought it will be more productive. So that's the reason I've kept it at the end. Okay. Intention is not to test you. Don't worry. Intention is just to help you because at the end of the day, all this we need to remember. Okay. No. So even at the end of the day, no matter how much money we earn, no, nothing will match your results. You give me 1 crore rupees and you tell me I failed an examination. I'll not be that happy to accept 1 crore from you. You give me 1 lakh rupees and say I passed the examination. I'll happily accept that 1 lakh. Because that for a teacher, not for me as such, for every teacher, no, your results bring a lot of happiness. So ultimately every teacher ka goal, whoever is sitting in this position, their main funda is not just to make money. First priority is always to make you pass, because that feeling difficult to express. That gives that psychological kick, they say, no, that gives us more for that. Okay. So hopefully next time when I meet you, it will be at CA final level. Okay, or at least you could say that CA group 2 is done, or we will meet at CA group 1 intercom, whatever. No pressure, just say. Sir, I will give you only 1 lakh rupees. Sir, we will not give 1 lakh rupees also. Hey, what? Ganapati Limited is considering scored 40 out of 50 because of you. It's not because of me, ma. Scoring is all because of you. Okay, you put in the efforts, you will get the marks. Scoring ka credit I never take. Rank ko passing the examination is entirely students ka credit. Okay, because as I tell, I have students who have scored rank also, but at the same time I have students who have scored 25-30 also. Scoring is entirely on the student's sake. How much efforts you put, Based on that, your marks will be determined. Now let's see how much marks we will score in this question. Ganapati Limited has 3 financial plans. Stop. Sir, for indifference point, we compare 3 plans or at a time only 2 plans? In indifference point, that formula we just now spelled it out. That does only comparison of 2 plans at a time, not 3. Okay, if it is 3 means what to do, we will see. Key information they have given. How much money you need for investment? 2 lakh. Plans of financing proportion. We have 3 plans, sir. 3 options of raising finance. Under plan A, 100% of the money will come through equity. How much money we need? 2 lakh. That means entire 2 lakh will come through equity. In second plan में 50% will come through equity. 2 lakh का 50% is how much? 1 lakh. 1 lakh through equity, another 1 lakh through debt. Third plan, 50% will come through equity, 50% through preference shares. These are the 3 options available for the company. What is the requirement? Cost of debt is 8%, cost of preference shares is 8%, tax rate 50%. Equity shares ka face value may be 10, but they are issued at a premium of 10. That means are we issuing the shares at 10 rupee or 10 plus 10? Issue price is how much? 20. Expected EBIT is 80,000. If you do this particular project by raising the funds, how much EBIT are you expecting? 80,000. First, you need to calculate EPS, normal. And then you need to calculate financial break-even point. Then you need to calculate, indicate if any plans dominate and compute EBIT range for the plans of indifference. Indifference point they're asking for all the 3 plans. We will see. One by one we will take. First one is very straightforward. We need to calculate EPS. They have given what? EBIT. For EPS calculation, we need EBIT or we need each. How do we get each, sir? First, take the numbers, sir. How much? What is the? Make a mental note of some numbers. How much is the EBIT? 80,000. Or maybe I'll quickly show it here. It's done. We have 1 plan or 3 plans. All the 3 plans we'll do parallel working note. How much is EBIT? 80,000. Doesn't matter. These are the 3 ways to raise the finance. First is 100% equity. Second is 50% equity, 50% debt. Third plan is 50% equity, 50% preference shares. Doesn't matter what plan you go for. EBIT is same. From EBIT, you'll reduce what, sir? Interest. Which plan has interest? Here it's only equity. Here it is equity and preference shares. This has debt. How much money come through debt? 1 lakh. Okay, and debt ka rate is 8% as I told in the question. We read 1 lakh ka 8%. How much is interest? 8,000. From EBIT, if you reduce interest, you're going to get earnings before tax. Then reduce tax rate. Tax rate was given to be 50%. You'll get earnings after tax. Till you're cool? Yes, no? Can we take each number or we have to reduce preference dividend? Reduce preference dividend. Which plan has preference shares? Only last plan. How much money came through preference shares? 1 lakh. And cost of preference shares was same as cost of debt, which is 8%. 1 lakh preference share capital, 8% is a dividend rate. So dividend is 8,000. From EAT, if you reduce preference dividend, you will get net income or each. Till here, I think everybody should be very, very fine with this. So this is your each. And do you know number of equity shares? Yes, sir. In first plan, how much money came through? How much money you want to raise totally? 2 lakh. Okay, 2 lakh rupees. The face value of the equity shares was 10. Did you issue it at face value or at premium? How much premium? 10 rupees. So what was the issue price? 20 rupees. On 1 equity shares, you are getting how much value? 20 rupees. How much money you want under plan number 1? 2 lakh. Entire money in first plan will come through equity shares. No? 2 lakh you want and the value of 1 equity shares is 20, means how many equity shares you will give under first plan? 10,000 rupees. Okay, sir. Each divided by number of equity shares will give you EPS. That's okay. Under second plan, how much money you want through equity shares? 2 lakh or only 50%? Because in second plan, 50% equity, 50% debt. So 1 lakh will come through equity, another 1 lakh will come through debt. So how much money through equity? 1 lakh. And what is the price of 1 equity shares? 20. So how many equity shares will you raise? 5,000. So 36 is your each, number of equity shares is 5. So your EPS will be 7.2. Any confusion or problem or cool? Cool. Third plan, number of equity shares same. We need 1 lakh only and each equity shares is 20. So number of shares will still be 5,000. First is a very, very simple exercise of finding EPS. This anybody can manage. Yes, sir. Now let's dive into the second requirement. Second requirement, they ask FBP. I think if my memory serves right. Yes, that's a requirement. They ask financial break-even point. And now you will tell. Tell me, sir. If it is 100% equity, if money has come through 100% equity, what is financial break-even point? First of all, financial break-even point means what? What should be your EBIT so that your EPS is 0? What should be your EBIT so that your EPS is 0? That only we call it as financial break-even point. If you are getting confused, think about it. Break-even point means no profit, no loss. If it is no profit, no loss means it should be 0. What should be 0? EPS. Okay. So what should be your EBIT so that your EPS will become 0? For a 100% equity plan, financial break-even point is what? Only if your EBIT is 0, only then your EPS also will become 0. So on the first plan, for EPS to become 0, EBIT should be 0. Because in first plan, it was 100% equity. Done, sir? In second plan, 50% money came through equity, 50% through debt. The moment you have debt, financial break-even point is what? EBIT should be equal to interest charges. This is your second plan. What are the interest charges under second plan? 8,000. That means if your EBIT is 8,000, means then only your EPS will become 0. Yes, people, comfortable? Okay. Third plan, what is the third plan? 50% equity, 50% preference shares. If you have preference shares for equity, anyway, break-even point is 0. Cut that off. Do you have preference shares also? Yes. For preference shares, what is financial break-even point? Preference dividend divided by 1 minus tax rate. Under plan C, we have preference shares. What is the preference dividend? 8,000. 8,000 divided by 1 minus tax rate. You'll get how much? 16,000. If your EBIT is 16,000, then this particular plan will give you EPS of 0. If you want, you can take. Here we have solved. No? Here we have taken 80,000 and calculated EPS. You take now 16,000 and calculate EPS for third plan. Instead of 80,000, you take 16,000 and calculate. Your EPS finally will become 0. That I've proved it to you. If you want, after going home, you can do this as an exercise. If you want to confirm. Nothing like that. Otherwise, you can trust whatever I'm saying. Oh, that's also okay. Your choice. Done, people. So second requirement is done, which is financial break-even point. Third requirement. What is third requirement? Indifference point. Sir, indifference point compares. We have 3 plans. Can we compare all the 3 or it's only 2 at a time? Only 2 plans can be compared at a time and find out indifference point. First of all, what is the meaning of indifference point again? Indifference point means what should be your EBIT? What should be your EBIT so that both the plans will give same EPS. Whether you go for plan A or whether you go for plan B, both will give you same EPS. That level of EBIT you need to find out. Okay, so we'll compare. We have 3 plans. Now, first we'll have to do it in various permutation combination. First, you'll compare A with B. Then you'll compare A with C. Then you'll compare B with C. Like this 3 indifference point you need to, like 3 times you need to compare and calculate. I'll show it for 1. I think you can manage the other things. Simple calculation. First, let's do A and B. Tell me the formula for indifference point. Indifference point means same EPS. Same EPS. EPS ka normal formula is E divided by number of equity shares. But we have a fancy formula. Tell me that fancy formula. EBIT minus I1 into 1 minus tax rate minus preference dividend. By doing this, we get E divided by E1. E1 means number of equity shares in plan 1. So that's what is the formula. I've written that formula. And Daivame, don't take EBIT 80,000. Then go in the. Sir, in this, by doing this formula, we are trying to find what? EBIT. If you take 80,000 as EBIT, sir. No, at 80,000 is plans giving you same EPS, sir. No. That means is indifference point ka EBIT 80,000 or something else? They told if 80,000 is a EBIT means what is EPS? Now we have to find what is indifference point ka EBS. Indifference point ka EBIT they would have not given. We need to solve. Okay, let's solve. First, EBIT do you know or we have to find that? We have to find. Minus I1. We are comparing plan A with plan B. In plan A it is 100% equity. That means interest is there or interest is not there? Interest is not there. That means EBIT we don't know. Interest is any which way how much? 0. Into 1 minus tax rate. In first plan, it is 100% equity. So preference dividend is there or not there? Not there. So minus 0. Okay, G. Divided by number of equity shares. Under first plan, number of equity shares is how much? 10,000. This is the numerator part of the left hand side part of the LHS of the first equation. Okay, G. Then equate it with RHS, right hand side. Right hand side also you need to put up EPS ka formula. What is EPS ka formula again here? EBIT minus I2 into 1 minus tax rate minus preference dividend divided by E2. Do you know EBIT or that only we are trying to find? We are trying to find minus I2. I2 means interest under plan number 2. In plan number 2, which is this, do you have any interest? Yes. How much interest is that? 8,000 rupees. So EBIT we don't know. Interest we know, which is 8,000 into 1 minus tax rate. Tax rate is 50%. In plan 2, it is equity and debt. So is there any preference dividend? No. That means preference dividend is how much? 0. Divided by number of equity shares. In plan number 2, number of equity shares is how much? 5,000. Solve this. That's all it is. Okay, simple cross multiplication. Way I like to solve is take the number smaller. 10,000 divided by 5,000 you do. How much is that? 2. That means you automatically take a smaller number. So these two, if you solve, you'll get 0.5 EBIT divided by 2. How did I get 2? 10,000 divided by 5,000. So you get. So instead of working with 10,000, it's easy to work with 2. No. So I prefer like this. Okay. Or you can simply cross multiply. 10,000 you can multiply to these components. 5,000 you can multiply to that components and you will get. So I hope I don't have to tell you solution of this. This equation we can manage. No? So by solving this, you will get EBIT how much? 16,000. So if your EBIT is 16,000, whether you go for plan A or whether you go for plan B, both will give you same EPS. Just for your reference, approved it, you check. If your EBIT is 16,000, what will happen? Both ka plan ka EBIT is 16,000. Reduce. Under first plan mein we have 100% equity. Interest is how much? 0. Second plan mein we have interest. We have already calculated. How much is the interest under second plan? 8,000. So reduce 8,000 interest. Okay, G. From EBIT, if you reduce interest, what are you going to get? Earnings before tax. Tax is 50%. If you reduce tax, you will get earnings after tax. Both these plans have any preference shares or no preference shares? That means preference dividend is 0. You will get each. Number of equity shares also you have already calculated. Plan 1 mein 10. Plan 2 mein 5. Copied that. 10 and 5. See how much is the EPS? 0.8 and 0.8. This you don't have to solve an examination. I've just done it for your reference. Indifference point means that if your EBIT is 16,000 means whether you go for plan A or whether you go for plan B, both will give you same EPS. That's all. Okay. If they ask you to prove, do it. Mostly they won't ask you to prove this because indifference point ka meaning only is that. Indifference point means what is the EBIT so that your EPS is same. They'll not again ask you to prove that. And this I've just done it for your reference. By chance institute goes and asks, do it. That's all. Doubtful. Our mother body is very careful that way and all. Just saying. If they ask you to prove it like this. Done. This is indifference point for what? A and B. We have one plan, 3 plans. We did A with B. Next will be A with C. A with C you want me to do or you will take care of it? Same. All the numbers are there here only. But only be careful. Don't take 80,000 as EBIT. EBIT we have to find. Rest all the numbers you can copy from first table and calculate the EBIT. Okay. So that EBIT you got it to be 32,000. Meaning if EBIT is 30,000 or 32,000, you can go for either plan A or you can go for plan C. Both will give you same EPS. Done, people. Now next is B and C. B and C. Look at these words and tell me the sentence which makes me super duper happy. Debt to preference shares. So debt to preference shares. Debt to perfect. Sir, for B and C there is no indifference point. Why? Just now I said finance manager will prefer debt plan or preference shares plan. Any finance manager will prefer the debt over preference shares because on debt you always get one extra advantage. What is that? Tax benefit. On preference shares, will you get tax benefit or no tax benefit? If you just check in this problem, interest rate on debenture is 8%. Preference dividend was also 8%. But on debt you will get tax benefit. On preference dividend you don't get tax benefit. So debt plan will always dominate preference shares plan. Indifference point means you should get same EPS. Can debt and preference shares give you same EPS or debt is always better? Debt is always better than preference shares because debt will give you tax benefit. Preference shares will not give you tax benefit. So since debt dominates preference shares plan, for plan B and C, if you calculate, you can calculate, I've done it here. For plan B and C, if you calculate indifference point, no, it will get cut off. Check here. 0.5 EBIT minus 4,000 is equal to 0.5 EBIT minus 8,000. This 0.5, this 0.5 will get cut. That means what is EBIT? Not there. Because debt, there is no indifference point for plan B and C because plan B has a debt, plan C has no debt. Debt plan will always have the advantage over preference shares. For B and C, you will not have any indifference point because debt gives you that extra benefit. That's all. Okay, G. Move forward. So concept is done. I think 1 or 2 questions. I think I still have, 1 minute. Let me see. Two. Is it okay if I take till 3:15, maximum 3:30? If you're okay with that, I can do one more question on this topic. Otherwise, I will give you lunch break now and then or continue, whatever you feel. Okay. If you have time, one question extra, I will take it. That's fine with you. Another 20 minutes, 15-20 minutes if you are ready to stay, that is more. That's okay? Okay. So let this question, whatever you're doing, come in exam, sir. Yeah, sure. If it comes, you're also happy. I'm also happy. Balle. It has come. This question I have seen. A similar question. I mean, in fact, a similar version of this is there in the RTP mate, latest RTP also, I think. I don't remember fully. I remember quickly seeing this. Okay, let's take question number 14 then, if you're comfortable. Online, only few people are telling. Take on. Others are telling you take. I already left. Okay. Following data are presented with respect to quality automation company. Okay. So read if you want. One way, whenever the problem is big, no sir, ICA will make the question sometimes look big than what is really required. So in that case, what you can do is first read the requirement. That way you will get to know what information is really relevant and what is not so much. So you need to find out probable price of the share. Price of the share means you need to find out MPS, market price of the share they're asking. When they say share, it is always equity shares. When additional funds are raised through loan, when additional funds are raised through equity shares, maybe we have two options. We need some extra funds. We can raise extra funds by issuing equity shares, or we can raise extra funds by taking a loan. We have two options. If you go for both the options, if you go for first option, what is MPS? If you go for second option, what is the MPS is what they're asking. Retained earnings of the company is given to be 1.2 crore. Now with this in mind, let's read the above table ka data. They've given profit before interest and tax. Profit before interest and tax, or you can also call it as EBIT, or also known as operating income. One and the same. How much is that, sir? 52 lakh. Okay. Some hidden adjustments are there over here, so you need to be a little careful. Interest rate on debenture, how much? 12%. And interest amount is how much? 12 lakh. Sir, I told you one shortcut way to calculate the debenture value. If interest amount is given, interest rate is given. Can you find out the debenture value? Yes. Interest amount divided by expected interest rate, we are told. Here, is there any market rate different or same? That means market rate and actual rate here are same. So interest amount is 12 lakh, interest rate is 12%. So 12 lakh divided by 12% you will get how much? 1 crore rupees or 100 lakh rupees, which is your debenture ka value. Okay, that they would have not told. It's a hidden adjustment. How you will get to know? Only when you practice few questions, you will get to know how it is, why it isn't. Now I can't tell. So how do you know? With practice. That's the only way. Alright. Then from EBIT, if you reduce interest, you will get earnings before tax. From EBT, if you reduce tax, you will get profit after tax. Then number of equity shares they've given of 10 each. What is this? This 8 lakh rupees is not value. They clearly told what is this. This is the number of equity shares. That means this 8 lakh rupees is it's not 8 lakh rupees. It is 8 lakh. Is an 8 lakh shares. And each share ka value is how much? Equity share capital is always shown at face value. The face value of one share is 10 rupees and we have 8 lakh shares, means what is the equity share capital value? 80 lakh rupees is equity share capital ka value. I hope this is comfortable. Okay. EPS they've given 2.5. Earnings per share 2.5. P ratio. P ratio means, how do you get P ratio? Name itself is saying. Name only formula is there. PE ratio. P for price, E for EPS. So P ratio is given by price means MPS. E for EPS. If you do MPS divided by EPS, you will get something called 10 rupees. That is a PE multiple. What it means is, if PE multiple is 10, meaning if company is earning 1 rupee, investors are willing to pay 10 rupees to buy that company ka shares. If company is earning 1 rupee, investors are willing to pay 10 rupees to buy that company ka shares. Why? Earnings may be 1 rupee now. In future, my earnings will be 1 or it will be more. So investors feel if PE multiple is on the higher side, means the expectation is company will grow more in future. That's the reason they're willing to pay more. So that, again, just for your reference, I told. Okay, stop there, sir. Sir, if you know PE multiple, if you know EPS, can you find out MPS? Yes. How, sir? How do you get MPS? EPS multiplied by PE ratio. They asked MPS in this problem, mind you. They asked to find out what here in this problem? MPS. PE multiple is given. EPS is also given. How do you get MPS? MPS is multiplication of these two, which is how much? 25. This is existing. This is existing. They would have given some data where the things would have changed. After the change has happened, you have to find out MPS. How do you find out MPS? We got it now. How do you find out MPS? To find out MPS, simply we take PE multiple and multiply it by the EPS. That's how we'll get it. Okay, now check this data. Company is planning to start a new project with a capital outlay of 40 lakh. So how much additional funds they need for some expansion? 40 lakh more they need. 40 lakh more funds. You are informed that a debt equity ratio. How do you calculate debt equity ratio? They have given here debt divided by debt plus equity. You take debt in the numerator divided by debt plus equity in the denominator. Calculate that number. If that number is higher than 35%, if that number is greater than 35%, then the cost of equity will become 12.5 and P multiple from 10, it will become 8. So if debt equity ratio increases means P multiple will become 8. Simple concept. If company borrows more debt, if the company borrows more debt, risk same, risk increased. Risk increase. If risk increase means investors will be ready to pay same PE multiple or lesser? Lesser. Correct. Now from 10, since the debt you borrowed higher means P multiple from 10 it will become 8 because the risk level has increased. That's what they're trying to say here. Okay, G. Alright, this will only happen when? From 10 P multiple it will become 8. When? Only when the debt equity ratio crosses 35%. Not in other cases. If it is lesser than 35% means P multiple will be 10 only. Only if this is greater than 35%, P multiple will become 8. Interest rate on additional debt. Obviously, sir, the risk has increased means will the banker give you, see earlier you have taken a loan at what rate? 12%. If the risk has increased means banker will give you at same rate or higher rate. If the debt equity ratio increases 35% or more means now interest rate on the additional amount will become 14%. Not on the existing. On the existing it will be 12 only. On the additional amount, the interest rate will not be charged at 12, it will be charged at 14. Okay, this is the things. Now, this data is holding good or it has changed? Changed. Because this is the data using existing capital structure. Now we are using existing capital structure or we want 40 lakh more funds? We want 40 lakh more. Consider this data and then find out MPS is what they're asking. Yes, sir, people. Good question. This is a base question in a way. Okay, like this same question they use and they've constructed 2-3 variants of this question also. But more or less, if you are able to tackle this, you should be able to tackle the other variations also. Okay. Now we know they've asked what, sir? They've asked to find out MPS. And we know to find out MPS, we need P multiple and EPS. P multiple we have to calculate or given. Given. If debt equity ratio is greater than 35% means P multiple will become 8. If debt equity ratio is less than 35% means then P multiple will be 10. So P multiple should we have to find or that is given? One component is given. Okay, now only thing we need to find out is what, sir? EPS. Yes. Means after you raise 40 lakh rupees additional money, what is your EPS? That is all we need to find out here. After raising additional funds of 40 lakh, how much is your EPS? To calculate EPS, we have to start from EB8. We have to start from EB8. Sir, after doing a new project, will your EB8 be 52 lakh? Currently, your EB8 is how much? 52 lakh. Now you are doing new project by investing 40 lakhs. Sir, if you are investing 40 lakh in doing a project, will you expect same EB80 or more? How much more? Given or missing? Missing. That's the crux of this question. If this new EB80, if you find means problem over. That's all. Let's just drama about this question. I hope this understanding everybody has got. Correct? How to find out? Very simple. Capital employed. You remember we discussed in ratio some topic called ROCE. Return on capital. Not your Valentine Days ka ROCE. This is ROCE. Return on capital employed. Sir, how do you get GP? How do you get GP percentage? GP percentage is given by what formula? Tilde. This and all you should tell. Otherwise, I'll feel bad. GP upon sales into 100. So, GP is a return on sales. GP is a return on sales. Similarly, ROCE. How do you get ROCE? Sir, wear red color, sir. You'll get return on capital employed. Okay. That means here for GP percentage, you took GP upon sales. Okay. Here, what is a return? ROCE is return on capital employed. Capital in FM includes only equity share capital, preference share capital, or also debt? Also long-term debt. Yes, no? That means, should I take earnings before tax, earnings after tax, or EB80? EB80. Correct. So ROS is given by the formula. Instead of GP, you will substitute with EBIT because you have generated the return from loan also. You have taken the money from debt guys also and running the business. Before you pay interest, how much return have you generated? Before paying money to the loan guys, what will you pay to the loan guys or debenture guys? Interest. Before you paid the interest, what is the return? Before you paid the interest, what is the return? We call it as operating income or EBIT. That is your formula. Okay, sir. Divided by what? You are able to generate this return. How? By taking the capital. Hence, the denominator will be what? Capital employed. How do you get capital employed? Equity share capital plus reserves and surplus plus preference share capital plus long-term debt. Debt means both bank loan as well as debentures. This is all you have to do. Okay, Saru. I told some hidden adjustment. Do you remember what is that? See, have they given debt value? No, sir. That's the reason we found debt value. Have they given equity share capital value? No, sir. Have they given retained earnings? Yes, sir. Why, sir? Sir, to calculate ROS, we need capital employed. To calculate ROS, we need capital employed. Capital employed was given or it was not given specifically? Exclusively or specifically, that not given, but that given information to calculate it. That's the reason we used that and we calculated the debt, equity shares and all here. Okay, Saru? Yes. First, let's calculate existing ROS. Existing ROS, meaning existing capital employed. Tell me how much is existing capital employed? How much is equity share capital? 80 lakh. Here, don't forget this information. Here, one bichara is sitting. What is that bichara? Retained earnings. How much is retained earnings? You can take the numbers in lakhs. 1.2 crore is nothing but 120 lakhs. So, I maybe write this. Retained earnings is 120 lakhs. So, what is your existing capital employed? You have 120 lakh retained earnings, equity share capital 80 lakh and debenture value 100 lakhs. So, if you add everything 200, 300 lakhs, your existing capital employed is how much, sir? 300 lakhs. Currently, you have a capital of 3 lakh. And using your current capital of 300 lakh, how much return have you generated? How much EBIT have you generated? 52 lakh. Using 300 lakh capital, you have generated a return of 52 lakh. So, what is your existing return? That's the first thing. That's what I've done here. I found out. Say, this is okay, no? I found out the existing debt value, equity share value, retained earnings value. I hope I don't have to take you through that again. So, existing capital employed is how much? 300 lakhs. Okay. And existing return as in EBIT is how much? 52 lakhs. So, that means what is the current return? The return on capital employed given by the formula EBIT upon capital employed into 100. 52 lakh divided by 300 lakh if you do, current return is how much? 17.33%. Currently, you are earning this much return. Okay, Saru? Now, you want to be in the current scenario or you want to expand? Expand. For that, you need how much additional funds? 40 lakh. But by taking additional finance, how much extra return you will earn, given or missing? By taking additional fund of 40 lakh, you will get some extra return. How much extra return you will earn, given or missing? Missing. The assumption is currently on your funds, how much return are you generating? 17.33. After taking this funds also, you will generate the same percentage of return, not same amount, same percentage of return. Okay. So that is the assumption. Since they have not given, this is the workaround to get it. Okay, Saru? Alright. Now, after how much additional funds you want? How much additional funds you want? You want additional funds of 40 lakh rupees. Sir, currently how much is your capital employed? 300 lakh. Now, how much more you will borrow? 40 lakh rupees. That means your capital employed will become how much? It was 300 lakh. If you borrow 40 lakh more means it will become 340 lakhs. So after you do this additional project, your new capital employed will become 340 lakhs. And on your capital employed, how much return are you expecting? 17.33%. Now your new capital employed is this much. Your return expected is this much. Means what is your new EBIT? Okay, this is your ROS. This is your capital employed. Can't you find out EBIT, sir? ROS is equal to EBIT upon capital employed. You know ROS, you know capital employed. Can't you find out EBIT? How do you find EBIT? ROS multiplied by capital employed. ROS percentage is this, capital employed amount is that. Multiply 58 lakh 92,200. It was how much before? It was 52 lakh. By doing new project, you will get 50. By doing new project, totally how much you will get? 58. This 58 lakh is not the return on new project. From 52, it has become 58. That means from the new project, you are getting roughly 6,92,200 more. Okay, Saru? That's a funda. But totally, new EBIT will become this much. Because to calculate EPS, we have to start with EBIT. Now we have got. This is one data missing, which we found it out. Time you want for reviewing or can you? Easy, manageable, but practice. All this will come because now, yes, FM is a question. When you try to revise the things, it will come. Because when you're revising, data is already there. You're just looking at, this. But the problem will come when you actually have to put that data on paper. When you have to write, the hands will be like, better. That wala feeling will come. Okay, so you practice, you will get it. Okay, there'll not be too much variations. Don't worry. Okay, people, this is done. Next. What is the requirement of the question? Do not forget that. We need what? MPS. To get MPS, we need P multiple and we need EPS. To calculate EPS, we need new EBIT. Did we get it? Yes, that we have got it. But hang on. They have given some goalie. What goalie they give? They gave some condition. What is that? After you raise additional funds, you have now two options to raise additional funds. How much additional funds you want? You need additional funds of 40 lakh. You have two options. First, you can take a loan. You can take 40 lakh ka loan, or you can raise 40 lakh through equity shares. You have two options. Now we need to suggest. Okay. But they've also given some extra fitting. What is that? Sir, if you take a loan, okay, or rather whichever option you go for, you need to calculate something called debt equity ratio. You need to do debt divided by debt plus equity. If this number is greater than 35%, then your PE multiple will become 8. And you will be able to borrow money not at 12%. You will not be able to borrow the money at 12%. You will be able to borrow at only 14%. That means we need to calculate one as a working note. What working note? Debt divided by debt plus equity we need to calculate. Can we do it? Next is that the working note. How do you calculate this? In fact, you do it quickly. Let's see. Here only we'll do it without looking at it. You need a debt. I'll write it as case 1 and case 2. I've solved it. Just quickly saying over here. Okay. Sir, tell me, sir. Debt divided by debt plus equity you need to take. What is our current debt? Current debt is how much? 100 lakhs. Current debt is 100 lakh. But you need how much money? How much additional funds you need? 40 lakh rupees. In first option, you are raising the additional funds through how? Loan. Loan is a debt. That means in first option, will the debt be 100 lakh or it will increase by 40 lakh? 100 lakh you already have. 40 lakh additionally you will borrow as loan in first option. Correct now? That means the debt will become 100 plus 40 lakh. Okay, sir. What is your existing capital employed? We have already calculated that. Existing capital employed is here. 300 lakhs. Currently, we have a capital employed of 300 lakh. After this new project, you will borrow more. Yes. How much more you will borrow? 40 lakh more. That means your new capital employed will become 340 lakh. Calculate this. New debt value 140 lakh. New capital employed 340 lakh. Calculate 140 divided by 340. You do how much is this now? 41 something. I think it's good enough. It has definitely crossed 35%. The benchmark they set was how much? 35%. Is it 35% or it has crossed? It has crossed. If it has crossed means you need to write some things. What is that? Now will your PE multiple be 10 now? Now will your PE multiple be 10 or it will become 8? Now PE multiple will become 8 and the new interest rate will be what now? You will be able to borrow it at 12% or you have to borrow at 14%? 14%. That is the data. This you need to put up it. This is your case 1. Case 1 is a case where you have taken the new funds through loan. Correct? Now same case you will have to work it out under case 2. In case 2 what are you doing? This 40 lakh you are raised by issuing equity shares. Sir, if you take 40 lakh through equity shares, then what will be your debt? Debt will change? No, debt will be still 100 lakh plus 0 only. It will be 100 lakh only. But what will be capital employed? It will be 340 lakhs. Correct? No. 300 lakh you already had. 40 lakh new equity shares you took. And the plan 2 it is equity shares. Correct? No. That means now you tell me, sir, what is PE multiple? What is this debt equity ratio? 20? No, I don't need the full number. 29%. That means the thing here they said data will change when debt equity ratio crosses 35%. Did it cross or did not? It did not. If it did not cross means now PE multiple will change or it will remain same. This will be 10% only. Okay, or rather 10 only. It's not PE multiple is not expressed in percentage. It is expressed in times. So 10 we write it. Okay, Zaru. In second case, I don't have to worry about loan at all because second option, are we taking loan or 100% equity? 100%. That means should we have to worry about new interest rate and all or not required? Not required. Yes, people. Then what, sir? What will be the market price of the share? If you want to raise equity shares means we need what, sir? Sir, if you want to issue new equity shares, will you raise it at face value or market price? Market price. How much is the market price? 25. Because the data is not changing means market price currently will be how much? 20 lakh. That means you tell me, sir, how many shares will you raise? How many shares will you issue? How much money? In second plan mein, you want how much money in totality? In second plan mein, how much money you want in totality? 40 lakhs. You want 40 lakh in totality, and the market value of one share is how much? 25 rupees. So how many shares will you raise? 1,60,000 shares. Because to calculate EPS, we also need number of shares. If you issue new equity shares, means number of shares will be same or number of shares will change. In this plan, number of equity shares will increase by 1,60,000. This is some base data for me to calculate EPS. I hope everybody is cool with this. That is what I've calculated here. Check. That's how I put it up as working note. In option number 1, 40 lakh you'll raise through. 40 lakh you'll raise through loan. That means the new debt will become 140 lakh. New capital employed will become 340 lakh. When you calculate the debt equity ratio, it crossed 35%. Since it crossed 35%, now PE multiple will become 8 and new interest rate will become 14. This is under plan number 1. In plan number 2, 40 lakh you will raise through new equity shares. If you raise new equity shares, debt will still be 100 lakh. Capital employed will become 340 lakh and debt equity ratio will become 29.41. Did it cross 35? No. That means PE multiple will still be original number, which is 10. That means you will be able to raise the share at current market price of 25. How much money you want through equity shares? 40 lakh. And market value of one equity shares is currently it is 25. After you raise additional funds and do the project, market price will change. That we will calculate. But currently this 40 lakh money you will raise by current equity price of 25. So how many equity shares you will raise? 1,60,000. In first option, are we raising money through equity shares or 100% debt? 100% debt. So will there be any new equity shares here? Will there be any new equity shares or zero? No equity shares will come. Existing equity shares will be there, but new equity shares will not come. These are base data. If you have sorted till here, means next is simple. Next one. What? Calculating what, sir? MPS. To calculate MPS, we need EPS and PE multiple. PE multiple given, EPS is what we need to calculate. To calculate EPS, we have to start with EBIT. And new EBIT, do you know? Yes, boss. How much? 58 lakh 92 200. Sir, whether you go for first option or second option, EBIT will be same. I gave you an example. ArivuPro raised 10 crores through equity shares. More number of students will come. ArivuPro raised 10 crores through debt. No number of students will come. No. By raising debt and or interest rate, by raising debt or equity shares, what will change? Interest will change. Maybe EPS will change. Will EBIT change or same? EBIT is same only. So whether you go for option 1 debt or option 2 equity shares, new EBIT will be same only. Yes, people. Now we need EPS. We are at EBIT. What we'll do? Quickly tell pa. EBIT we have. Next is what? Reduce interest. But hang on. Sir, we already have existing interest. Will that change or it will be same? It will be same. So what is our existing interest? Check the question. Our existing interest on debenture is how much? 12 lakh. Whether you go for first plan or you go for second plan, this 12 lakh will remain same. Okay. Now you will raise in first plan mein 40 lakh rupees money you will raise through debt. And this 40 lakh you will carry 12% interest rate or 14% interest rate? 14%. So if you go for plan 1, you will raise new debt for 40 lakh at 14%. 14 fours are 56. So the new interest is 5,60,000. Okay, Saru? So this is the one. In second option, will equity be there or no equity? Matlab in second plan, is new debt there or no new debt? Since there is no new debt, will new interest come or no new interest? So from EBIT, if you reduce interest, what are you going to get? Earnings before tax. From earnings before tax, reduce tax. Tax rate is given to be 50%. You will get earnings after tax. There is no preference dividend, so earnings after tax and each will be same. Divided by what, sir? You got your EPS ka numerator. We need one more component, that is number of equity shares. Currently, how many equity shares we have? Check the question. Currently, how many equity shares we have? 8 lakh. And the first plan you are raising additional funds through loan. That means will the number of equity shares change or same? Same. So if you go for first plan, number of equity shares will be 8 lakh. Okay. Under second plan you are raising money through what? Equity shares. And under second plan how many extra shares you will issue? 1,60,000. That means the number of shares will become 8 lakh plus 160, which is 960. So this is your this is your number of equity shares. So divide the two, you will get EPS. Okay, G. Okay, G. Yes, G. EPS got it, G. We need EPS, G, or we need MPS? MPS. How do you get MPS? EPS multiplied by P multiple. Sir, in first case, in first option, when you issued debt, we already know. Since the debt equity ratio crossed 35%, P multiple will be how much? 8. So that means in first option, PE multiple will be 8. In second option, did the debt equity ratio cross 35%? No. That means your existing PE multiple of 10 will be maintained. So multiply these two, you will get your MPS. That's all. Okay, G. Now, 1 second. Sir, if they ask you to give the answer based on EPS, you will select which plan? Forget about MPS. They simply ask you to, some questions come like that. They will ask like this, calculate EPS and suggest. Calculate EPS and comment or suggest. In first option, how much EPS it is given? 2.58. Second option, how much EPS? 2.44. Tell me which option will you go for? You will go for a lower EPS option or higher? So if they ask you to comment based on EPS, you will select which project? You will go for option number 1 because that is leading to higher EPS. But here, did they ask you to calculate EPS or ask you to calculate MPS? Yes. And do not forget, the goal of the company is not to increase EPS, which is a better metrics. You want earnings to increase or share price to increase? Share price. That means which is a better suggestion? You will suggest based on market price. First priority for suggestion is always market price. If market price data is not given, then you will give suggestion based on EPS. Here, should we have to suggest based on EPS or MPS? We can find out. In fact, we found also. Check. What is the MPS market price on the first plan? 10.62. Under second plan, 24.4. You will select that plan which gives lower MPS or higher MPS. You want lower share price or higher share price? The overall goal of this chapter is what? Choose that source of finance which maximizes value of the firm. Value get maximized when the market price of the share is maximum. Which option is giving you higher MPS? Second one, right? That means in this particular problem, you will choose option 1 or option 2. Since MPS data is available, you will always say select option 2 as it has higher MPS. Only if MPS data is not available, then you will give suggestion based on EPS. And based on EPS, if you are suggesting, means you will select lower EPS or higher EPS only. Higher EPS only. In this problem, since MPS was there, EPS we will totally ignore. Okay, because we have done some few problems in our regular class where we have given suggestion on EPS. So later on, you should not get confused. So calling out that point. Okay. Rakshita is saying capital employed. You tell once again, no sir. Capital employed is name only saying no ma capital. To your share capital, you add your long-term debt. That's all is your capital employed. Okay. So share capital here refers to equity share capital plus preference share capital plus reserves in surplus. Add all this. To that you add long-term debt. By doing that, you will get your capital employed. That's all it is. Okay. Existing capital employed was 300 lakh or 3 crore. You took 40 lakh rupees more money. Hence capital employed will become 340 lakhs. That's all. This problem is also done for. Okay, G. I think all the problems. 1 minute. I will quickly review the pointers, chart books. This is done. This is okay. This under capitalization and over capitalization usually comes for a 2-marker theory question at times. So you can review these points. Name itself is saying over capitalization means raising more money than required. Sir, I need 1 crore rupees money, but I raised 5 crore rupees money. I need how much? 1 crore. How much I took? Instead of 1 crore, I raised 5 crore rupees. Why? Sir, bank gave me loan at cheap rate. Bank was ready to give me loan at 7% interest rate. That's the reason instead of picking 1 crore, how much loan I took? 5 crore. Now you tell me, sir, is this good decision or bad decision? Sir, I need for my business purpose only 1. But I took how much? 5 crore. Will I be able to utilize 5 crore effectively or only 1 crore effectively? 1 crore. That means what? You tell me. This is as a finance manager, good or bad decision? Bad decision. That scenario only we call it as over capitalization. Over capitalization is a scenario where you borrow more than required. Okay. So the remedy for this is you have to repay the loan. Or you have to do some buyback. I've given some 3-4 pointers under this. You'll have to go through. Okay. Under capitalization is ulta scenario. You need money, but you are not ready to expand. Okay. Like let's assume that we are getting a lot of queries from Mumbai for CA coaching. So many people are calling us. Students, start a branch in Bombay, Amchi, Mumbai. We are telling, pada, will not open. Just kidding. Huh? Yeah. We don't want to open a branch. Sir, almost 500 students are inquiring for a course. Let's assume. Anyway, we're taking number. Let's take big. Why to settle for low number? 5,000 students are calling us from Mumbai to open a branch in Mumbai. But we are saying, we are reached Buddha zone. We have become a monk. We are like, no, we are happy. What is there in this world? We are happy with what we have. We don't want to expand. We don't want to expand. Sir, there is a lot of demand. There is a lot of demand. But are we ready to set up a unit there? No. That scenario, we call it as undercapitalization. When there is so much demand, we can take a loan or we can raise funds and set up a branch there. It will be profitable. Yes or no? But if some business, no, they don't want to expand, whatever reason it could be. So that scenario, we call it as what, sir? Undercapitalization. Undercapitalization is usually will be done by a firm which is earning a lot of profits. Let's say ArivuPro, we are earning about 1 crore rupees profit. Assumption, don't spread rumors. Okay, we are earning a profit of 1 crore rupees. Now we want to expand or no expansion? We don't want to expand. Let's assume we don't want to expand. That means what will we do with this money? If you earn 1 crore rupees profit, means if you don't want to expand, the only way we can sort this out is by giving dividend. That means in undercapitalization scenarios, the dividend payout ratio will be on the lower side or higher side? Higher side. Okay. So that means here this is also not good. So some remedies are you have to go for some bonus shares or stock split up. To reduce the dividend per share, you have to go for bonus or share split up. So 2-3 points you remember about undercapitalization and overcapitalization for 2 or 3 marks. 2 marks usually these sort of theories come. Okay, people. So yeah, I think I have covered all the things that I had in mind. Yes, people, thank you for your time and patience. Bye-bye. Well, hello people, welcome back after that short break. So continuing our marathon discussion further. So next topic we are taking is leverages. Okay. So yeah, last topic for today. Okay, now I think we are slowly that smile is coming back. Huh? Oh, finally, drilling over for today. Huh? Okay, sir, what is leverage? Sir, leverage means how one variable or one financial variable has an impact on another financial variable. One variable, one component, how it influences another component. That particular study only is what we call it as leverage. Okay, how one variable influences another variable. So what variable are we talking about? Fixed cost. How fixed cost has impact on EBIT or EPS. That is what we are trying to study as leverage. Sir, if there is no fixed cost, there is no leverage at all. Leverage analysis comes only if you have something called fixed cost. How fixed cost has an impact on EBIT and EPS or something is what we are trying to study in this particular topic. Okay, that is the meaning. Now next, leverage study is all about fixed cost. Because it's about fixed cost, we draft our financial statement or income statement in a slightly different format. Okay, till now we used to do in some way sales minus COGS is GP and all that, or cost sheet format and all we have followed. Now here we will draft our income statement. Since leverage is talking about fixed cost, our income statement gets drafted like this. From sales, you have to reduce variable cost. From sales, if you reduce variable cost, the number what you get is what we call it as contribution. From contribution, if you reduce fixed operating cost or FOC, then you will get EBIT. From EBIT onwards, it's the same drama. From EBIT, reduce interest, you will get EBT. Reduce tax, you will get EAT. Reduce preference dividend, you will get EAT. And finally, you will be able to calculate the EPS. So since leverage is about fixed cost study, we categorize the expense to be fixed cost and variable cost. So we redraft our income statement in this particular fashion for our leverage ka study or leverage ka analysis. Okay, this format, all of us are comfortable. Yes, we have done many questions on all this. Okay. Now, as far as leverages are concerned, there are 3 types of leverages. Operating leverage, financial leverage, combined leverage. You can call it as OL, FL and CL. OL for operating leverage, FL for financial leverage, CL for combined leverage. So, operating leverage is also known as business risk. Operating leverage measures business risk. So, to get operating leverage, or rather operating leverage measures the relationship between sales and EBIT. Operating leverage measures the relationship between sales and EBIT. Operating leverage is given by the formula. You can remember it as OLC. OL for operating leverage, you can remember it as OLC. Okay. OL for operating leverage, C for contribution, E for EBIT. Or another simple way to do it, leverage is all about fixed cost study. Now from sales and EBIT, between this window, between sales and window, which is the only fixed cost? Will sales remain fixed? No. Will variable cost remain fixed? No. What is the only cost remains fixed? FOC. FOC for fixed operating cost. So take one number above fixed operating cost. What you will get? Contribution. Take one number below. What you will get? EBIT. That is your operating leverage ka formula. So operating leverage is given by the formula contribution upon EBIT, or you can simply remember it as OLC. Okay, sir. This is one way to calculate operating leverage. Okay, there are about 8 to 9 formulas. I think maybe 10 formulas. You remember that and you will be able to tackle all the questions. First is this: operating leverage is given by the formula contribution by EBIT. There is another way to calculate the operating leverage. So I told operating leverage measures what relationship between what and what? Operating leverage measures the relationship between sales and EBIT. So operating leverage is given by the formula percentage change in EBIT divided by percentage change in sales. That's another way to calculate the operating leverage. Either you can use first formula or you can use second formula. Answer will be same. Though they call this as degree of operating leverage, it's as good as operating leverage. Sir, when will we use first one? When will you use second formula? Sir, if contribution EBIT is directly available, you will go for first one. Or if percentage change in EBIT is given. Sir, if you want to calculate change, can you calculate the change with one set of data or two sets of data? Sir, 100 became 120. 100 became 120. That means it has changed. To calculate this change, we need one data or two data? Two data. If they're giving you two data points or they give you two sets of data, you will use this percentage wala formula. Okay. If only 1 year data is given, then you will use the first formula. That's how to identify. Because to calculate percentage change, you don't need one component, we need two components. Hence, that way you'll figure out whether to use the first one or the second one. Doesn't matter whether you use first one or second one, answer will be same. Just a different way of calculating the same thing. Okay, sir? Or sometimes what they'll directly do is, they will directly say percentage change of sales is 40%. Percentage change in EBIT is 40%. Percentage change in sales is 10%. So if this percentage is directly given, then you will apply percentage wala formula like that. Okay. So those are the two ways to which you can calculate operating leverage. Another way to calculate operating leverage is through margin of safety. Costing is already done. MOS you already know. Margin of safety. Break-even point is no profit, no loss zone. Margin of safety is profit zone. Okay, till break-even point, you will not make any profit or not you will make any loss. Beyond break-even point, you will start making profit. That zone only we call it as margin of safety. So operating leverage is given by one more formula where it is here. Operating leverage is given by the formula 1 upon margin of safety. Inverse, ulta of margin of safety if you do, you will get operating leverage. All this I have proved it to you. Again, not the time. We don't have so much time. So proving exercise for formula, I will not take up in this particular section. We'll only run through the formula. So another way to calculate operating leverage is 1 upon margin of safety. Basically, ulta of margin of safety you have to do. Okay, these are the three ways through which you can calculate operating leverage. So how do you calculate margin of safety? This is where costing comes into picture. Tell me, how do you calculate margin of safety? Margin of safety. How do you calculate costing over? Margin of safety is given by the formula total sales minus up to break even. Margin of safety is what zone? Margin of safety is profit zone. So up to break even point, will you make any profit? No. So margin of safety is given by the formula total sales minus break even point sales divided by total sales. You take total sales and reduce break even point sales. You will get what, sir? Profit zone. That profit divided by actual sales if you do, you will get margin of safety. Okay, sir. Usually in all our leverage problem, you don't have to use this. Margin of safety will be directly given. In case they don't give, you may have to probably use this. Rare, but a possibility. Fine. This is one. Now to calculate margin of safety, you need a break-even point. You need a break-even point. Sir, how do you calculate break-even point? Sir, you can calculate break-even point in units or you can calculate break-even point in value. You can calculate in units or you can calculate in value. If you want break-even point in units, again costing formula, it is given by the formula fixed cost divided by contribution per unit. Take the fixed cost in the numerator divided by contribution per unit. If you do, you'll get break-even points in units. Okay. If you want break-even points in value, then break-even point is given with the formula fixed cost divided by PV ratio. PV ratio here stands for profit volume ratio. Okay. So fixed cost divided by PV ratio will give you break-even point in sales. Mostly we'll be using this particular data if required for our this. This is not much relevant. This is the most important or more important version of the formula from this. Okay, sir. And how do you get PV ratio? PV ratio is like contribution percentage. How do you get GP percentage? How do you get GP percentage? GP divided by sales into 100. Similarly, contribution percentage, you tell me. How do you calculate? Contribution upon sales into 100. That contribution percentage only we call it as profit volume ratio or PV ratio. So PV ratio is given by the formula contribution upon sales into 100. That's all it is. Okay, sir. These are another data. So 3 formulas we learned there and another 3 added here. So 6 overall. Another 4 more will come and this leverage ka drama is over. Remaining everything is on the question side of things. Okay, Ji. So far okay. Okay, give me a quick recap of the formula. What are those formulas? Three types of leverage. Leverage is basically study of fixed cost. Only fixed cost is there, leverage will come into picture. Otherwise, leverage study is not required. Okay, so since we are talking about fixed cost, we redraft our income statement, or we create our income statement in this format. What is that? Sales minus variable cost gives you contribution. Contribution less fixed operating cost will give you EBIT. From there onwards, same format, no change. Okay, and three types of leverage are operating leverage, financial leverage, and combined leverage. Operating leverage measures business risk, given by the formula OLC, that is contribution divided by EBIT, or operating leverage measures the relationship between sales and EBIT. Okay, so operating leverage is given by the formula percentage change in EBIT divided by percentage change in sales. Or another way to calculate operating leverage is through margin of safety. Operating leverage is equal to 1 divided by or 1 upon margin of safety. These are the three ways to calculate operating leverage. To calculate margin of safety, how do you calculate MOS? Total sales minus break-even point sales divided by total sales. That is the way you can calculate margin of safety. That is one. To calculate margin of safety, you need break-even point sales. If you want break-even point in units, then the formula will be fixed cost divided by contribution per unit. If you want break-even point in value, in sale value, then you will get fixed cost divided by PV ratio, profit volume ratio. And profit volume ratio is given by the formula contribution upon sales into 100. That's okay, G. Alright. So why do we calculate operating leverage? We calculate operating leverage. What does it imply is, okay, sir, let's say you calculated operating leverage and you got it to be 2. You calculated using whatever method you calculate operating leverage and you got it to be assumed 2. Operating leverage measures the relationship between what and what? Sales and EBIT. Sales and EBIT. Sir, if operating leverage is 2 means, what is the indication is, let's say sales increased by 10%. If sales increases by 10%, operating leverage measures the relationship between topmost number, sales, and EBIT. If operating leverage is 2 and if sales increases by 10% means EBIT will increase by twice of that. Why twice? Because operating leverage is 2. So that means if sales increase by 10% means your EBIT will increase by 20%. That is a shortcut way to find out EBIT. Okay. Similarly, let's say if sales reduces by 10%, or maybe I'll take a different person. If sales reduces by, let's say, 20%, then what will happen? If operating leverage is 3, and sales reduced by 20%, then what will happen to EBIT? If sales is reduced means EBIT also will reduce by same percentage or triple. Thrice 20% into 3, how much is that? 60%. This is the indication. So this is a quick way to find out the data. Without putting income statement, we can find out EBIT and all through the leverage analysis. It's a shortcut way of finding a few things. That's all it is. Okay, Saru. All this I've proved it to you. Again, proving I'm not doing it right now. Okay, just I think this is good enough for our examination. Because when we do regular classes, no, I personally believe in not mucking up. I'll explain you the logic of the formulas and all that stuff. But on the examination, ultimately what we need is remembering the formula. So that's what will be our primary focus in this particular session. Okay, this is one. All right, sir. Okay, this is done. Next, can I move on to the next one? Any doubt so far? No. Okay, next one is the next leverage. What is the next leverage? Financial leverage. Financial leverage measures, or maybe one more point I'll just tell before this. Sir, if you remember, we discussed just now break-even point. Break-even point. Some students will have that confusion because in the previous topic also we studied about break-even point. In previous topic, we studied what break-even point? We studied financial break-even point. Here we are talking about what, sir? Operating leverage. We need all this we need break-even point to find out margin of safety. And margin of safety is required to find out operating leverage. And operating leverage stops at what value? EBIT. Operating leverage stops at EBIT. So this particular break-even point, no, is not financial break-even point. It is operating break-even point. So here break-even point means what it means is what should be your sales? What should be your sales so that your EBIT is 0? In financial break-even point, what was the things? In financial break-even point, what did we study? What should be your EBIT so that your EPS is 0? That is your financial break-even point. In financial break-even point, you want to make EPS 0. EPS should become 0. Here we're not talking about financial break-even point. We're talking about operating break-even point. Operating profit is what, sir? EPS, or operating profit is EBIT? EBIT. So here in this particular fundament, what we are trying to find out is what should be your sales? What should be your Sales. So that your EBIT will become 0. That is what we are trying to say. So these two are not same break-even point, different break-even points. Not required for exams, just saying it for your reference as such. Okay, Saru? Alright, moving along to the next one. Financial leverage. Financial leverage measures financial risk. It measures, somewhere I must have written, it measures financial risk. Okay, so quick fix, simple. Sir, now operating leverage measures relationship between what and what? Sales and EBIT. From sales to EBIT, operating leverage measured. Financial leverage picks it up from there. So financial leverage measures a relationship between EBIT and last most number. What is the last most number? EPS. So financial leverage is trying to measure the relationship between EBIT and EPS. EBIT and EPS. Tell me the formula. You know this. If you want to find out financial leverage ka percentage formula, tell me the percentage formula. Financial leverage is trying to measure the relationship between EBIT and EPS. So financial leverage is given by the formula percentage change in EPS divided by percentage change in EBIT. That is one way to calculate. But to calculate to calculate change, we need one data points or two sets of data. If they give you 2 years data, maybe you can calculate percentage change and apply this formula. Or if they directly give you percentage change, you can apply this formula. If they give you only 1 year data, can you calculate this or not possible? No. If they give you only 1 year data, you can't use this particular formula. You have to use one more formula. What is that? Same funda. Now, sir, till EBIT we have covered. Now check. From EBIT, if you just check EPS, leverage study is all about fixed cost. Fixed cost, right? In this, what is a fixed cost? Is interest a variable cost or fixed cost? Is interest that you pay on bank loan, is it varying or fixed? Fixed. Simple way to remember operating leverage or leverage ka formula is take one number above fixed cost, take one number below fixed cost. Above one number, interest is a fixed cost, yes. So take one number above that, which is what? EBIT. Take one number below that, which is what? EBT. So financial leverage is given with the formula EBIT divided by EBT. If they give you 1 year data, then you can calculate financial leverage using this particular formula. Okay, sir? EBIT upon EBT. But I have a doubt, sir. Sir, in this even preference dividend is fixed, no, sir? Even preference dividend is also fixed. So means completely you ignored. Sir, in majority of our problem, preference dividend will not be given. Hence, financial leverage is given by the formula EBIT upon EBT. So if preference dividend is not there, if preference shares are not there, then financial leverage is given by the formula EBIT upon EBT. However, by chance, if they give you preference shares, till now actually we didn't have problem on preference shares. I think in this attempt, RTP or MTP, they introduced of this. One problem they brought in. We will cover it. Okay. Till now we used to only discuss this at a theoretical level. Now they brought in problem also. We will cover it at the end where I will say it. Okay. If by chance company has preference shares, on preference shares the company will also have preference dividend. If you have preference dividend, then financial leverage is given by the formula EBIT divided by EBT minus preference dividend into 1 minus tax rate. You remember you calculated financial break-even point like this. So do this. This is how you calculate financial leverage if preference shares are there. So there are two ways. You need to check whether preference shares are there or not there and accordingly do the calculation. Yes, people? Okay. Wait or carry on? Carry on. This is about financial risk. Okay. Now, last we have is the combined leverage. Sir, operating leverage measures business risk. Financial leverage measures financial risk. Combined leverage measures total risk. Combined leverage measures total risk. So your income statement starts with what? Sales. Ends with what? EPS. Combined leverage is trying to measure the relationship between the topmost number sales and bottommost number EPS. Tell me the formula for combined leverage then. Percentage formula you tell. Combined leverage is given by percentage formula. Percentage change in EPS divided by percentage change in sales. This is one way to get a combined leverage if they give it in percentage terminology. Okay. Or directly you can calculate combined leverage is simply given by the formula operating leverage multiplied by financial leverage. That's another way to calculate it. If you know operating leverage and financial leverage, multiplying these two automatically you will get combined leverage. If that is not given, you can use maybe this particular data and calculate. Some problem we have used this, so I have written this as well. That's how you calculate combined leverage. Okay, that's it about I think conceptually more or less we heard. Or 1 minute, hang on. Yeah, this is again theory. This is a good theory. They asked, I've seen in quite a few papers this particular concept being tested. Financial leverage is a double-edged sword. It's a double-edged sword. Sword, talwar. Sword, Sword will have what, sir? On one hand, you will have holding component, correct? That's smooth. And other hand, it will be sharp. Now we are talking about double-edged sword. Double-edged sword means both the side it is sharp. So you can go like that also. You can go like this also. Okay. So that means what? We have some advantages also. We have some disadvantages also. Okay. So financial leverage measures what risk? Financial risk. Okay. Normally you take finance what, sir? Through what? Either will you prefer preference shares or debt? So they're trying to say over here, taking a debt is a double-edged sword. Taking a debt is a double-edged sword. Because through debt, you will get some advantages also. You will get some disadvantages also. Tell me, what are the advantages if a company raises the funds by taking debt? If the company raises the money through debt, advantages is on debt, you will always get a tax benefit. That is one. And compared to equity, debt is always a cheaper source of finance. Because debt people, are they taking higher risk? No. Who are taking higher risk? Equity shareholders. If you are taking higher risk, you will expect higher return. So compared to equity, debt is a cheaper source of finance and you also get a tax benefit. Those are the advantages. What about disadvantages? One disadvantage is, sir, taking a debt can create something called financial distress. Financial distress is simple scenario. Okay. Sir, your pocket money is 1,000 rupees, but your expenditure is 1,500 rupees. Happy or sad? Very sad. Okay, why 1,000 rupees? I'm talking about my stipend. Okay, now Zamana has changed. Okay, let us say your pocket money is 25,000. Your expenditure is 35,000. How much pocket money? Okay, anyway, we'll see. Stipend how much? Pocket money how much? 25. Expenses how much? 35. Good scenario or bad scenario? That only we call it as financial distress. Financial distress is a scenario where your inflows or rather your outflows are greater than your inflows. Expenditure, suppose company has an expenditure of 1 lakh, but they have an inflow of only 80,000. Income is 80,000, but expenditure is how much? 1 lakh. Is this a happy scenario or sad scenario? Sad scenario. That only, if this goes on means finance manager will be happy or he'll be stressed out. This particular scenario only we call it as financial distress. If inflows are not sufficient to pay the outflows, or rather if outflows are greater than your inflows, that particular case only we call it as what, sir? Financial distress. Okay. Now, if this financial distress goes on for 2 to 3 years, what will happen? Can company survive or company will liquidate? If this financial distress goes on for some period of time, means maybe 6 months, 1 year or whatever, then the firm will get insolvent. That is a disadvantage. Okay, sir. All right. You could have some non-bankruptcy cost also. You could also have some non-bankruptcy cost. Now, let's say, sir, company has taken a big loan. They have taken 100 crore rupees loan. Okay. Now, it's a startup company. They have taken 100 crore rupees loan. Would you like to work in that startup company? Sir, taking a debt is a risk. This company has taken a big loan means they have taken a big risk. Now, you are an employee in that company means you will be ready to work for lower salary or higher salary? Higher salary. Because you are taking a risk. Because this startup may be there today. After 1 month, it may shut down also. So, non-bankruptcy cost is that. Okay. So, if you are taking a higher risk means your employees and all will start demanding lesser salary or higher salary? Higher salary. That's a disadvantage. Okay. Or your creditor also may tell. Earlier, let's say your creditor used to give you 30 days. Earlier, let's say creditor used to give you 60 days credit. 60 days credit. Now, the creditor is saying, I will only give you 30 days credit. From 60 days, he made your credit to only 30 days. Why? Risk has increased. If risk has increased means creditors will have buku. What buku? Sir, whether you will pay or not, what is the guarantee? That's the reason creditor is saying from 60 days, now I'll give you only 30 days credit. So all this could happen due to taking a lot of debt. These are some disadvantages. That's the reason we say financial leverage is a double-edged sword because it has some advantage as well as it has some disadvantages. A popular question. 2-3 points, advantage, disadvantages, just in case it comes. You should be able to write some points and do some marks. Swaha. Yes, so people. Okay, this one also is a theory. It got tested in one of the RTP question as well. They'll give you the data. They'll ask you to calculate leverage and tell whether it's a favorable leverage or an unfavorable leverage. It's a favorable financial leverage or a unfavorable financial leverage. It's very simple. Suppose, sir, I have taken a debt. And doing a particular project. I want money to do a new project and I've raised that money how? Through debt. From that project, I am getting a return of 15%. How did I arrange project ka money? Through debt. Debt will come at free of cost or it will have a cost. So you calculated the cost of debt and it came to be only 10%. Sad or happy scenario? Happy scenario. Why? Sir, my cost of arranging the fund is only 10, but the return from the project is 15. So if the return on investment, if it is greater than cost of debt, we call it as favorable leverage. Okay. If it is ulta scenario, then it becomes unfavorable scenario. This was also asked in one of the RTP. I think this attempt RTP or MTP, they've asked this. Okay, they've asked you to calculate and comment on this, whether it's a favorable or unfavorable. We'll do it at the end. Remember it. Okay, people. So financial leverage, operating leverage, and combined leverage fully we have calculated. Now anything else is remaining. 1 minute, let me review. Chart book. Go in the. Yeah, this is okay. I think this two particular pointers I will come when I take up a question. Okay, this is a problem specific pointer. I'll do that. A couple of questions and then maybe remind me. I'll come back to this points and discuss what is this. Other things are okay. That's all is the concept of leverage. Now we'll take up 1 or 2 questions. But this attempt, I don't know why Institute got a special liking for you. They've created some good questions on leverage. Little brain spinning wala questions. Okay. All right. We will see. We will take it up. Not scaring you, just sharing with you. Okay. All right. So till now, usually leverage used to come as a pretty straightforward topic. Institute felt that probably it is too easy. Students are ignoring leverage topic. They are saying leverage is nothing. They're doing. That's the reason I said, Magne, wait. Yeah, they brought in a couple of atom bomb they put. We will see. Good questions. I mean, just that 1 or 2 points you should be little concerned about. Don't worry. I'll take care of that. At the end, maybe we'll take care. Now we will dive into the questions. So question number 9, we will see. Capital structure of PS Limited as on 31st March 2021 as follows. Equity share capital, face value is 100, total equity share capital 10 lakh. Debentures, there are 10% debentures, face value 100 and debenture ka value is also 10 lakh. What are they asking? During 2021 current year, sales has reduced to 1 lakh units compared to 1,20,000 in the previous year. Last year it was 120 units, now it has become 1 lakh units. Selling price, however, is 12 per unit only. Last year and current year, selling price was same. How much? 12. Variable cost is 8 per unit. Now you know, no sir. For variable cost, we have to construct our income statement in a slightly different way, which is what? Sales minus variable cost is contribution. Contribution minus fixed operating cost, EBIT. So for that, they have given all this data. Fixed expenses was 2 lakh. Sir, whenever they give you fixed expenses in the leverage question, always take it as fixed operating cost. Take it as FOC. Okay, don't assume that because interest is also a fixed cost. Don't assume interest is included here. Always assume that interest is excluded. Usually they will mention it as fixed operating cost. If they don't mention, if they give you fixed cost, always take it as FOC, just a convention, no logic. And income tax rate is how much, sir? 30%. Using this data, you have to calculate degree of financial leverage. Sir, the moment they say degree of financial leverage, don't assume that we have to calculate percentage formula. Whether you can call it as financial leverage or whether you call it as degree of financial leverage, it is one and the same. You can calculate financial leverage the way you want it. You have multiple formulas, whichever you want, you apply and get the answer. That is absolutely okay. You need to calculate financial leverage at 120 units. 120 units was for the previous year. And current year, it has become how much? 1 lakh. So current year and previous year, they're asking financial leverage. And similarly, for current year and previous year, they're asking operating leverage. They're also asking percentage change in EPS. Let's calculate. Multiple ways to present. This leverage case and all is more like a mathematical equation. There is no one way to approach. You can approach in multiple ways. Okay, I will teach it in one particular way. If you feel I have another method which gives same answer, bindas, go ahead and use. No need to comment. Okay, sir, I did this, I did this. You did it, you're great. You do it. Okay, multiple ways are there, so no need. You have complete authority to do it. As long as you get the correct answer. Final answer, if it matches, okay much. Otherwise, put your method into dustbin and follow what you're doing. Okay. All right. That's what it is. Usually, I mean, you can follow multiple methods. You will get the right answer. But just say. So can we do it? Simple question. Just an overview of leverage this particular question gives. Okay. But we have to calculate it what, sir? For 1 year or 2 years? 2 years. Current year, it was 1 lakh unit. Last year, it was 1 lakh 20,000. Okay. Keep the basic data. What is the selling price per unit? 8. 12. What is the variable cost per unit? 8. Fixed operating cost is how much? 2 lakh. Remember this, then we will start. I've put it up here. So for 1 lakh 20,000 units in the previous year and 1 lakh units in the current year, we need to calculate OL and FL. First, we will draft the income statement. First, we'll take what? Sales. So when we say sales, we need sales in units or sales in value? Value. How many units? 1 lakh? 20,000. What is the selling price per unit they gave? 12. So sales will give you 14 lakh 40,000. Okay. Similarly, last year, current year's number of units sold is 1 lakh and selling price is 12. So 12 lakh rupees is the sales in the current year. From sales, you have to reduce what? Variable cost. Variable cost per unit is how much? 8. So 120 ka 8 is 9 lakh 60,000. 1 lakh ka 8 is 8 lakh. From sales minus variable cost, if you reduce, you will get contribution. Simple enough. Reduce what now? Fixed operating cost. Fixed operating cost was 2 lakh. From contribution, if you reduce fixed operating cost, you will get EBIT. From EBIT, we'll have to reduce the interest. Hang on. Does the company have debt? Yes. How much is the debt of the company? 10 lakh. How much interest rate debt carries? 10%. So 10 lakh ka 10% you do. How much is it? 1 lakh. That means the interest you have in this particular component is 1 lakh. From EBIT, if you reduce interest, you will get EBT. From EBT, reduce tax rate. Tax rate was given to be 30%. You will get EAT. There is no preference dividend. Rather, there is no preference shares. We have only equity share capital and debentures. If there is no preference shares, there is no preference dividend. If there is no preference dividend, EAT and EASH are same. You can call it as EASH or you can also call it as net income. Okay, how do you calculate EPS? We have EASH. We also need number of equity shares. How much equity share capital? 10 lakh given in the question, and face value of each share given in the question is 100. So number of shares is how much? 10,000. So if you do it automatically, 126 divided by 10, if you do, you will get 12.6 as the EPS for the last year. And how much is the EPS for the current year? 7. Why did I calculate this? Because in the last requirement, they asked percentage change in EPS. So that's the reason 2 years ka EPS I've calculated. You can also calculate percentage change in EPS using combined leverage formula also. That is also another way. As I told, multiple ways. But I preferred this straightforward way. That's it. Okay. Now, percentage change. Sir, last year, how much was the EPS? 12. Current year, it has become 7. So, how do you calculate a change percentage? If you want it in formula, change in amount divided by original amount. Into 100 if you do, you will get the change ka percentage. So, if 12.6 became 7 means what is a change? 12.6 became 7 means how much is a change? 5.6. 5.6. So, this is the change amount divided by original amount. Original amount means previous year. Previous year, how much it was? 12.6. It was 12.6. In the current year, it has reduced by 5.6. So, how much is the reduction in the EPS percentage for the current year? 44.44%. Like this, you can calculate or use combined leverage. Whichever way you want, you can do it. Yes, people. Now, they have asked operating leverage and financial leverage. What is operating leverage ka formula? Contribution divided by EBIT. What is contribution for previous year? 480. What is EBIT? 280. So 480 divided by 280 you will get operating leverage for last year. Similarly, contribution for current year is 4 lakh. EBIT is 2 lakh. So 4 lakh divided by 2 lakh will give you operating leverage of 2. Okay. Next, financial leverage. How do you get financial leverage? Stop. Financial leverage has one formula or two formulas? Normal may only we have two formulas. One with the preference shares, another one without preference shares. Here we read the problem. Do we have preference shares? No. If you don't have preference shares, the formula is EBIT divided by EBT. If you have preference shares, then financial leverage is given by the formula EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Like you did financial break-even point for preference shares. That data you'll have to insert it. Here anyway, preference shares is not there. So EBIT is 280 for last year and EBT is 180. 280 divided by 180 if you do, you'll get financial leverage of 1.55. Same data you do it for current year, you will get the value. A very, very straightforward question. Hopefully this only comes in your paper. Okay. Sometimes, sir, again, they'll play around. Okay. If one question, if they make it tough or tricky means another chapter ka question, they make it very straightforward. Like that, they will play around. Okay. So I don't know what chapter, but you always should go with the mentality that 1 or 2 questions will be lengthy, will be tricky, mostly both. Okay, doesn't matter you take coaching from whichever faculty. How many other RTPs you study? 1 or 2 questions will definitely be new. Don't worry about that. Focus on the things that you know and don't do silly mistakes in that. Completely, properly present it so that if these question comes, even a 1 marker you should not lose. Single mark also you should not lose. If they ask for 5 marks means the entire 5 marks you should do swaha. Like that. Okay, new questions, it is okay. All right, fair enough. How much ever we know, we will write it. But in the questions we know, we should write it with very, very precision. Don't lose out any marks. That way, you will score a good marks, exemptions and all in your paper. Okay, this is done. No, next, maybe this one again I'll do. This is one popular adjustment. A small question, but a popular adjustment seen quite a few times in exam. So I'll take up this question. As much as possible, as I told, I've picked up study material question only for the benefit of a larger audience. Because marathon, many people will watch. That's the reason I picked up from here. Don't worry, some RTP, MTPs also will be taking up later on as well. Always remember, it is not the number of questions. It is also how you are solving the question helps you. You should have a clarity over the questions. Okay, just like that, mugging up will not help. This question comes means I will do this. This means I'll do that. Some people have that habit. I'll check that. This comes means I will do like this. This formula I'll apply. That is okay. But suddenly, if they give you a new adjustment means first gali I will get. That dabba fellow, what did he teach? Chumma, I paid him money. That guy is going on trip after trip. Here I am writing exam after exam. Like that, to me, my khandan, my whole family, you will give galis in different languages. Because we have all India audience. No, everybody, every language ka gali, I will learn. Okay, fine. And then you will say, you will blame your fate and all. Sir, you also need to know why you are doing a particular thing. Only that will help you to score better. So try to understand if you have time. If you don't have time now, I only have 15 days means now logic and all putting in dustbin. Do whatever you can. Time availability is also important. Okay, let's see what we can learn from this question. Sales revenue of this company is 20 per unit and output is how much, sir? 20 lakhs. So total sales is 20 lakhs. Selling price per unit is 20 rupees. Contribution is 10 lakh. Okay. Sir, we don't have to put entire income statement. For operating leverage, what do we need? Contribution. If you want directly, you can start instead of sales directly, you can start with the contribution also. If necessary data is there, you can start with that. Okay, that is your choice. At the present level of output, degree of operating leverage is 2.5. Sir, they can give you DOL. Doesn't matter whether they can say OL or DOL. It is one and the same. Operating leverage, how much? 2.5. Stop. How do you get operating leverage? Contribution divided by EBIT. Sir, operating leverage, you know. Contribution also, you know. That means by applying operating leverage ka formula, you can find out EBIT. So, leverage, 99% of the cases will be a missing information question. That is examiner's favorite. Direct question, usually from leverage, they will not give. They will give you some data and some data will be missing. You have to find out those missing figures and then calculate leverages. That's the way ICA usually prefers to ask leverage question. So using these two, we can find out what now? EBIT. Okay. Company does not have any preference shares. Awesome. The number of equity shares are how much? 1 lakh. Tax rate is 50%. Interest rate on debt is how much? 16%. What is, read this requirement carefully. What is the EPS at sales revenue of 20 lakh? They're saying sales is 20 lakh only. What is the EPS and what is the amount of debt capital? They're asking you to find out the value of debt. You know this. How do you find out debenture ka value? Debt ka value? Interest amount divided by expected rate. Here expected rate and market rate are same, which is how much? 16%. Interest amount, if you find, interest rate is already given. Easily you can find out the debt amount. That we have sorted. Only interest component we need to find. Okay. Then they said, what is the EPS? What is the EPS and what is the amount of debt capital? If read this line, if 25% decline in sales will wipe out EPS. Yes. Wiping out EPS means EPS will become 0. Suppose EPS was 2. EPS was 2. Before this, it was 2. If sales reduces by 25% means EPS will become 0. From 2, it became 0 means how much is a change in EPS? 100%. Correct. Now, wipe out EPS means EPS has become 0. If it is 5 means from 5 it is becoming 0. So, how much percentage decrease? 100% decrease. Correct. Now, whatever be the number, from 5 it will become 0 means there is a change of how much percentage? 100%. From 10, if the EPS was 10 before, okay, if 25% sales reduces means EPS will become 0. That means how much decline? 100% decline. Indirectly, they're telling you what, sir? Wiping out EPS means EPS is reducing by 100%. This should click to you. Did it click? Or I am chumma unnecessarily shouting. Clicking. Okay, clicking. Stop. Sir, they talked about EPS. They talked about sales. Now, think on the leverage side of things. Which leverage measures the relationship between sales and EPS? Sales is topmost number. EPS is bottommost number. Which leverage measures topmost and bottommost? Combined leverage. Okay. So they told in the problem, if 25% sales reduces means EPS will reduce by 100%. Can't you find out combined leverage through this formula? Combined leverage ka formula is what, sir? Percentage change in EPS. What is the percentage change in EPS? 100%. Divided by percentage change in sales. How much is percentage change in sales? 25%. That means indirectly they're telling you what, sir? Combined leverage is 4. Sir, operating leverage you know. Combined leverage you know. Can't you find out financial leverage? Yes. Like this, one by one. It's a domino effect. One component falls means all the component also will go on falling. You have to identify what you should start with. Okay. Okay, let's go ahead and take up. First information, they gave contribution and they give you operating leverage. Let's put up the formula. How do you get operating leverage, sir? Contribution divided by EBIT. So do you know operating leverage? Yes, given to be 2.5. Do you know contribution? Yes, it is given to be 10 lakh. Do you know EBIT or missing? Missing. So let's, through this, you'll be able to find out EBIT. When you solve this equation, you'll get EBIT to be how much? 4 lakh rupees. Okay, correct. EBIT is 4 lakh rupees through this particular equation. Okay, ji. Second one, they talk something about sales and they talk something about EPS. Which leverage measures the relationship between sales and EPS? Combined leverage. So how do you get combined leverage in percentage? They expressed in percentage term, no? They said 25% decline in sales will lead to wiping out of EPS means there is a decline in EPS of 100%. Which formula uses that percentage? We call it as degree of combined leverage. So how do you get the degree of combined leverage? Percentage change in EPS divided by percentage change in sales. There is a decline in sales of how much? 25%. Why EPS is wiped out means percentage change in EPS is 100%. That means indirectly how much is combined leverage? 4. Sir, you know operating leverage 2.5. You know combined leverage which is 4. Using this data easily you can find out financial leverage. Because how do you get combined leverage? Another way to calculate combined leverage is what? Operating leverage multiplied by financial leverage. Combined leverage is 4. Operating leverage is 2.5. Financial leverage is how much? 1.6. Okay, Saru. This is 1. Good. Okay. Alright. Sir, examiner ka one favorite adjustment is, or maybe I think I don't have to use this here. It's fine. I think I can go with the normal approach. Sir, how do you get financial leverage ka formula? Tell me. What is a normal way? Normal way to get financial leverage is what? EBIT divided by EBT. Sir, do you know financial leverage? Yes, just now we found out. Do you know EBIT? Yeah, we found out before only. Sir, you know financial leverage. You also know EBIT. Can't you find out EBT? Yeah, apply normal financial leverage ka formula and find out EBIT. Tell me, all this is tough. Even a school kid also will do this. But the essence of this is time. It should click after this working note. What is the next working note? That should click within the next few seconds. It will click to every one of you. But to majority of you, it will click after 1 or 2 minutes. And that 1 or 2 minutes is golden in examination. That's all it is. So solving all these questions are very straightforward. Can you solve it within the required time is the question. And that will come only with the practice. The more and more questions you solve, you will get to know what is a fair idea or how is the working notes in general. So now, financial leverage, we got it 1.6. EBIT, we got it to be 4 lakh. EBT, we don't know. EBT is how much, sir? When you solve, you will get EBT to be 2,50,000. Done, sir. This is done. Sir, we found out all this, but did they ask all this in examination or only 2 things? In this question, they asked only 2 things. What are those? EPS, and they asked debt. Right? To calculate EPS, we need 2 data. What are those 2 data? To calculate EPS, how do you calculate EPS? Each or net income divided by number of equity shares. Sir, we already have EBT, no? I mean, should I have to start from sales or I'll start from EBT? EBT only I'll start. So that's what I've done here. I've put up income statement, but I've started only from EBT, or you can start from EBIT also. Since we need interest also, we'll maybe do that. Okay. Sir, how much is EBIT? I don't need all this. I can find out all this, but do I need it? Is that the requirement of the question? If they had asked income statement, I would have had to populate all of this. Did they ask you income statement? No. So hence, it's a format I've copied from regular notes. So in this problem, I'll start from EBIT. Do you know EBIT? Yes, EBIT we found to be how much? 4 lakh. This we found out as working note number 1. Okay. Then EBT, do you know? Yes, EBT we found out through working note number 3. How much is EBT? 2 lakh 50,000. EBT where here? Working note number 3 we found out to be 2 lakh 50,000. Very simple, sir. Sir, if this one is 4 lakh, from EBIT, if you reduce interest only, you will get EBT. If EBIT is 4 lakh and if EBT is 2.5 lakh, means interest has to be what? 1 lakh 50,000. How did you get that? 4 lakh minus 2 lakh 50,000, you will get 1 lakh 50,000. It's not necessary for everything you need to prepare working note. Some workings you can show here on. In fact, in regular class, I always used to say, prepare income statement in this format, particulars, amount and workings. If it is simple workings, you can show it here only. No need to prepare another working note to save time. But ultimately, if you want to prepare a separate working note also, you can do it. Yes, sir. Okay. From EBT, you need EBT for EPS or EISH? EISH. How do you get EISH? From EBT, you have to reduce tax. Tax rate is 50%. So reduce that, you will get earnings after tax. They told in the problem, there is no preference shares. If there is no preference shares, there is no preference dividend. That means EAT and EISH will become same. How much is that? 1,25,000. If you read the question, they only told in the question, number of equity shares was given in the question to be how much? 1 lakh. Sir, EISH you know 125. Number of shares is 1 lakh, means how much is EPS? These two cut division, which is 1.25. That is the requirement. Dana, sir? Yes. Okay. Then they asked to debt capital, value of debt. You know the formula. What is that? Interest amount divided by interest rate. So interest amount is how much? 1 lakh 50,000. Okay. We'll take it here only. Interest amount is 1 lakh 50,000. Interest rate was given in the question to be how much? 16%. So 1 lakh 50,000 divided by 16% you do. How much is that? 9 lakh 37,500. That is the value of your debt. That's all we have done here. Interest amount divided by interest rate. Easy. That's all. Okay. This was a pretty straightforward question. I wanted you to be aware of this adjustment. This is a good adjustment. Okay. Of late, I'm seeing this being connected in many problems. Sales changes by this. Okay. One more way they will say is, I've seen it in a couple of examination papers. Instead of EPS, listen to this carefully. We are not doing any question on this because it is same, but I want you to understand this concept. What is this? Sir, in this problem, what they told? 25% decline in sales will wipe out EPS. Wipe out EPS simply means EPS is reducing by 100%. Instead of EPS, we have seen in the last some mock papers of previous year EPS, they will say net profit. They'll say if sales decreases by 25% means it will wipe out net profit. Net profit means profit after tax. Okay. Profit after tax. It is one and the same. What is that? Maybe I'll just show you, go back to my chart and tell you this. Sir, from sales to contribution, they all go hand in hand. They all go hand in hand. Hand in hand means girlfriend, boyfriend. If girlfriend goes left means boyfriend also will compulsorily go left only. Correct? No, same thing. Sales contribution will always go up till here. From sales till contribution, everything will go hand in hand. Meaning if sales increases by 10% means variable cost also will increase by 10%. Contribution also will increase by 10%. Okay. So all this is same. Whether you say sales increase by 10% or whether you say contribution increases by 10%, it is one and the same. Now from here to here, from EBT to EPS, everything will go hand in hand. From EBT to EPS. Okay, because sir, simple. If there is a leverage is a study of what? Fixed cost. If there is no fixed cost means everything will go hand in hand. Now after earnings before tax, is there any fixed cost check? After earnings before tax, is there any fixed cost? Yes, sir. Preference dividend is a fixed cost. In majority of the problem, preference dividend will not be there. If there is no fixed cost means leverage will always be 1. Leverage will always be 1. Meaning what? If leverage is 1 means what? If there is 1% change in one component, other component also will change by 1%. If operating leverage is 3, that means what? If operating leverage is 3, that means what? If sales increases by 1%, then EBIT will increase by 3%. Thrice of that. If operating leverage is 1 means, if sales increases by 1% means EBIT also will increase by 1%. Sir, if there is no fixed cost, means leverage is always 1. That means what? If this EBT increases by 10% means EPS also will increase by 10%. It's as good as that. So all this will go hand in hand. Okay, sir. Because after EBT, do we have any fixed cost or no fixed cost? Preference dividend in majority of the problem will not be there. That's the reason we say these numbers go hand in hand. Whether you say EPS reduced by 100% or whether you say net profit means profit after tax. Okay. Or maybe simply I will write it here. You tell me, sir. Now, if I tell in the question, EBT reduces by 50%, what will happen? Tell me. If EBT reduces by 50% means what will happen to earnings after tax? Earnings after tax also will reduce by 50%. Each also will reduce by how much? See, each, if you want, you can calculate with number. You don't have to take my word. Assume some random numbers and calculate it. You will get the same answer. Each also will reduce by how much? In fact, I proved it also in regular class, if you remember. So, each also will reduce by how much? 50%. EPS also will reduce by 50% because all this will go hand in hand. They will change by the same percentage. If one increases by 50% means other also will increase by 50%. If one reduces by 50% means all others also will reduce by 50% only. Okay. So in some problem where they will say instead of EPS, they'll substitute with net profit. Net profit means profit after tax. Whether they say that also, it is one and the same only. Okay, whether they say net profit or whether they say EPS, it makes any difference or same? Same. Okay, so coming back to this question, suppose they tell this word, just for my clarity, I'll tell that sentence, see if you agree with me. Where is that problem, pa? Here. Suppose if they tell in this problem, instead of wiping out EPS, if they say it will wipe out net profit, it will wipe out net profit. Net profit means profit after tax. Profit after tax, we call it as net profit. Now tell me, sir. Net profit is wiped out means what is happening to net profit? Net profit is reducing by 100%. And we know if whether you say net profit reduced by 100% or whether EPS reduced by 100%, it is one and the same. Still you will say combined leverage is 4 only. Got it? Like that. Instead of EPS, they have substituted in one of the examination question with the net profit. But will there be any change in the way you calculated or ditto? Okay. Whether 100% reduction in net profit is there means there will also be 100% reduction in EPS also. So you will follow the same steps. So I hope you don't need any extra problem for this. Got it? No, only this word change. Okay, Ji. All right. Now another examiner's favorite adjustment through leverage is this. What is it? Sir, how do you calculate normally financial leverage? If 1 year data is given, how do you calculate financial leverage? EBIT divided by EBT. EBIT divided by EBT. Okay, 1 second. Where have I written that? So EBIT divided by EBT. Correct? Now 1 second, sir. Sir, how do you get EBT? Can you tell me in words? Sir, either you can write EBT or to calculate EBT, can I say EBT is nothing but EBIT minus interest. So instead of EBT, can I substitute? I can substitute what? Instead of EBT, what I can write? Instead of EBT, I can write EBIT minus interest. Because from EBIT, if you reduce interest, what are you going to get? EBT only. Okay, this is one examiner's favorite adjustment. How they will ask this is, check here. They will give you financial leverage in the problem. Okay, they will give you financial leverage. They will give it to you in the question. And they will also give you interest. It will be a missing information question. These sort of questions, they will ask you to construct income statement majorly. Financial leverage will be given and interest will be given. Tell me, how do you calculate financial leverage for 1 year? If 1 year data is given, EBIT divided by EBT. 1 second, hang on. Instead of EBT, can I substitute? Yes, instead of EBT, I can write what? Instead of EBT, I can write EBIT minus interest. By doing this, what will happen? You will be able to find out EBIT. How? Financial leverage is anyway given in the question. Interest also anyway is given in the question. That means only missing component is what? EBIT. By substituting this, you will be able to find out EBIT. This is one way or one workaround or one method to find out EBIT, which they will use. In one problem also, we will take it up. Understood? Another way is they will give you operating cost. They will give you operating leverage, and they will also give you fixed operating cost. Operating leverage they will give you, and FOC they will give you. Sir, how do you calculate operating leverage for 1 year? If they give you only 1 year data, how do you calculate operating leverage? Contribution divided by EBIT. Okay. Financial leverage will any which way be given in the question. Okay. Okay. Sir, instead of EBIT, tell me the format of income statement once again for me. Sales minus variable cost is contribution. Now, stress. Contribution minus FOC will give you EBIT. Okay, 1 minute. Sir, instead of EBIT, can I substitute? Yeah, instead of EBIT, what I can write? Either I can write EBIT or I can write contribution minus FOC, because from contribution minus FOC, if you do only, you will get EBIT. So this substitute, instead of EBIT, we will substitute what, sir? Contribution minus FOC. That's what it is. So operating leverage is equal to contribution divided by EBIT. Instead of EBIT, now I will write contribution minus FOC. By doing this, what will happen? Operating leverage is given to you in the question. FOC is given to you in the question. Only thing missing is what, sir? Contribution. By doing this substitution, you will be able to get contribution. This is two hidden adjustment usually we see in our leverage wala questions. Especially this one though repeats in a lot of questions. First one. This one not so common but has come a few times. Done, people. This is problem related pointer I've just quickly brought in. Okay. Another quick way is whenever in leverage question, if you get stuck, you pulled all your hair, still you are not able to solve. If you are stuck, one simple way is prepare an income statement. Though they have not asked, prepare income statement as a working note. Let it be. That will help you to figure out few things. Normally, few things you will never be able to figure out. But the moment you put income statement, you'll get in a high, like that feeling will come. Okay. We'll see. Some components are like that. If you're getting stuck, means one way to get out of that stuck wala feeling is to prepare income statement. Though are not asked, simply prepare it quickly as a working note. You'll be able to get a few things. Okay. That is another exam pointer. Maybe one more question I will take. Since anyway in RTP they have added some good leverage question, I will only maybe do one more and I think that's good enough. Or maybe this one. Okay. Some time is there. Is it okay? Another 15 minutes if I take? 15 minutes means I'll do 2 questions. 5 minutes means 1 question. How many you want? 1 or 2? 1 venuma, 2 venuma. Evadu venu? Illa 1 vena sir. Utrunga. That's the best option. So, is it okay? 2 questions can be quickly review. Okay. Sir, calculate operating leverage, financial leverage and combined leverage from the following data. This is a very simple question, but presentation is important here. Okay. Now, you need to calculate OLFLCL under situation 1 and 2 and under plan A and B. We have situation 1 and 2 and as well as we have plan 1A and B. That means we have different permutations and combination. Installed capacity means I have a total capacity to produce how many units? 4,000. But actual production and sales is only 75%. That means in the current year, I have the capacity to produce 4,000 units. But actually I have produced and sold how much? 75%. That means what is my actual capacity? 3,000 units. And all the units are produced as well as I have sold. And each unit I'm selling at what price? 30. Variable cost I've given. Okay, fine, sir. Now, anyway, for operating leverage, we need data. Let's present our income statement. Our income statement starts with what? Sales. How many units you have sold? 3,000. At what per unit? 30 per unit. Where it went? Sales is 3,000. 3,000 into 30 is how much, sir? 90,000. Sales minus variable cost. How many units have you sold? 4,000 ka 75%, which is 3,000. What is variable cost per unit given in the question? The variable cost given in the question is 15 per unit. So 3,000 units you have sold. 15 is a variable cost. If you do, it is 45,000. Okay, Saru? No. Hang on. They gave you one case or 4 cases? 4 cases. What are those 4 cases? One, we have situation 1 and we have situation 2. Case 1 and case 2. Then we have plan A and plan B. This is financial plan A and financial plan B. Stop. Look at the financial plan A. In plan A, okay, you need totally how much funds? 20,000. If you go for plan A, 10,000 money you will raise through equity shares and 10,000 through debt. Meaning 50% money will come through equity, another 50% through debt. If you go for plan B, then 15,000 will come through equity, meaning 75% money will come through equity and balance 25% will come through debt. You tell me, sir, will this have any impact on operating leverage? Operating leverage measures the relationship between sales and EBIT. EBIT ka full form is earnings before interest and tax. Sir, this plan is only affecting your debt value. It's affecting your capital value. If you take more debt means you will pay more interest. If you take less debt means less interest. Now you tell me, interest has any importance for operating leverage or no importance? I mean, should we worry about financial plan for operating leverage or absolutely irrelevant? Irrelevant. That means as far as operating leverage is concerned, I only have to be concerned about situation 1 and situation 2. Because in first situation, if you are there means your fixed cost is how much? For first situation, fixed cost is, and I told you, when they give you fixed cost, always take it as in these problems, fixed operating cost. If it is first situation, fixed operating cost is 15. If it is second situation, fixed operating cost is 20. Is FOC required for operating leverage? Very much yes. That means I will have to present this data situation wise. Situation 1 and situation 2. Okay. Alright. Sales. Will sales change or same? Same. Whether it is situation 1 or situation 2. Sales is still 3000 units. What is the selling price? 30 only. So whether it is, that's the reason I'm presenting operating leverage situation wise. Whether it is situation 1 or situation 2, sales and variable cost will be same. Only what is changing between situation? Between situation, only one data is changing, which is what? Fixed operating cost. Okay, Ji? Sales minus variable cost, if you do, you'll automatically get the contribution. Contribution less FOC. Now we are in which situation? Situation number 1. Go back to the question. If it is situation number 1, what is your fixed cost? 15. If it is situation 2, what is your fixed cost? 20. So copy that. If it is situation 1, fixed cost is 15. Situation 2, it is 20,000. From contribution minus FOC if you do, you'll get EBIT. I mean, these two data is sufficient for us to calculate operating leverage. How do you calculate operating leverage? One number above fixed cost, one number below fixed cost, given by contribution divided by EBIT. So 45 divided by 30 if you do, you'll get operating leverage of 1.5. 45 divided by 25 you do, if you do, you'll get operating leverage of 1.8. So if it is first situation, operating leverage is 1.5. If it is second situation, operating leverage is 1.8. That's the first requirement of the question. Easy. Alright. They asked only operating leverage or also financial leverage? Financial leverage also they have asked. Even combined leverage also they have asked. Now, sir, financial leverage is effective. How do you get financial leverage? How do you get financial leverage? EBIT divided by EBT. And how do you get EBT? How do you get EBT? EBIT minus interest. And interest is same in your financial plan or changing? In your financial plan, debt value is same or debt value is different? If debt is different means obviously interest also will be different. For operating leverage, I ignored this. For financial leverage, can I ignore this or I cannot? I cannot. I have to consider this. That means for operating leverage, I presented my data situation wise. Okay, because financial plan was absolutely irrelevant. But for financial leverage, can I ignore this or I have to consider this? Consider this. Now I'll present the data plan wise. That means I will change my columns. There it was situation, no? For operating leverage, it was situation. For financial leverage, I'll present the data plan wise. Plan A and plan B. Can you calculate the data only plan wise or also situation wise? Also situation wise. That means here in the inner column, I'll write situation 1. Situation 1. Main heading here is plan A and plan B. You can present in other format also. Absolutely okay. I'm just doing this. That's all. So plan A, plan B. First, I will calculate financial leverage for situation 1. Stop. For financial leverage, what do we need? EBIT and EBT. EBIT and EBT. Sir, if it is first situation, your EBIT is how much? 30,000. If it is second situation, your EBIT is 25. I mean, it is same or changing? First, I am calculating what, sir? Situation wise. First, if it is first situation means how much is EBIT? If it is first situation means whether you go for plan A or plan B, EBIT will be 30. Because if it is situation 1, EBIT will always be 30. Correct? I got it from the previous working. Correct. From EBIT, I have to reduce what? Interest. Now, if it is first plan, if it is plan A means how much interest I'll have to pay. If it is plan A means debt amount is 10,000 and interest amount is 20%. That means what will be the interest, sir? 10,000 ka 20%, which is 2,000. If it is plan B, then the debt value will be 5,000. Interest rate is 20%. That means the interest amount will be 1,000. That means what? For plan A, interest is 2,000. For plan B, interest is 1,000. I put that up here. Check. Will it change based on situation? Will this interest change based on situation? No. Interest will only change based on the amount of debt borrowed. Correct? It will only vary based on the plan. Okay. Now, if it is plan A, then interest amount again is how much, sir? 2,000. If it is plan B, interest amount is 1,000. So copy that. Doesn't matter. Situation could be whatever. If it is plan A means interest will always be 2,000. And if it is plan B means interest amount will always be 1000. Okay, G. From EBIT, if you reduce interest, you'll get EBT. These two come minus if you do, again you'll get EBT. How do you get financial leverage? EBIT divided by EBT. So these two you divide automatically, you'll get financial leverage. Presentation, calculation is very simple here. The way you present the data is what matters here. 30,000 divided by 29,000 if you do, you'll get 1.03. Now I calculated financial leverage for both plan A and plan B, but only for first situation. We have to calculate every data situation wise also, plan wise also. So plan wise I've already calculated, but for situation 1. Next I will calculate the same, but for situation 2. Now I'll write in the heading situation 2. If it is situation 2, what is your EBIT? Doesn't matter which plan you go for. If it is situation 2, EBIT will always be 25,000. Now I'm doing it for situation 2, no? For situation 2, EBIT is 25,000. Okay, now you take this data. Okay, G. From this, reduce interest. If it is plan A, interest will always be 2,000. If it is plan B, interest will always be 1,000. So reduce. From EBIT, reduce the interest, you will get EBT. EBIT may divided by EBT will give you financial leverage. That's all is this question all about. Just a quick way of taking the data and putting in the proper format. Okay, G. Now operating leverage over, financial leverage also over. Next one is what, sir? Combined leverage. How do you get combined leverage? OL into CL. But careful. We have to present the data situation wise also, plan wise also. So I'll keep the format same like financial leverage. First I will take plan wise and then I will calculate first for situation 1. Sir, how do you get combined leverage? Operating leverage multiplied by financial leverage. Careful, we are in which situation? First situation. Sir, if you are in first situation, data is this. If you are in first situation means operating leverage will always be how much? 1.5. So if you are in first situation means operating leverage is 1.5 under both the cases. Yes, sir. Correct. Okay, then we need financial leverage. Financial leverage check. If it is financial plan A and if it is situation 1, what is your financial leverage? Financial leverage is 1.07. Take that number I've taken here. Okay, Saru. Similarly, if it is financial plan B, and if it is situation 1, what is financial leverage? 1.03. This is your financial plan B, situation 1. For financial leverage will be 1.03. Operating leverage we have taken, combined financial leverage also we have taken. Multiply the two to get the combined leverage. Okay, Saru? Okay. Just make me happy. You chuma nodding, I think. I don't know whether you're really getting it. Just to be on the safer side. For a second situation, can you calculate combined leverage for me? Guide me or tell me the value. That's all. For second situation, you are in second situation. You will get, how do you get situation 2? Okay. And then we are in plan A and we are in plan B. Just to be on the safer side, just testing. I know you are smart. Okay. Just for my reference. How do you get combined leverage? Operating leverage into financial leverage. I'm showing you the data. So this is the data. What you do? Guide it. We are doing it for situation 2. Sir, if it is situation 2, if your situation 2 means operating leverage will always be 1.8. So means it is 1.8. OL will always be 1.8. We need only OL or also FL? FL will be same or it will change? Now you are doing FL. If it is situation 2, and plan A, for situation 2, financial leverage is 1.08. That means which number you will multiply? 1.08. Multiply 1.8 into 1.08. How much? 1.944. Okay. Seeing. Okay. Similarly, if it is plan B, if it is situation 2, what is financial leverage? 1.04. So multiply 1.04. How much are you going to get? 1.872. Okay, that's the answer. That's what we have written here. 1.944 and 1.872. That's all. Okay, now, sir. Done. This question is also damar. One last question can we take up for the day? Exciting. You know, day's ending means always exciting. Day starting means that feeling. Okay. Sir, this is an RTP May 24 wala question. You remember I told examiner ka favorite equation? What is that equation? They will give you interest and they will give you financial leverage. How do you get financial leverage? EBIT divided by EBT. You will substitute. you will write it as what? Financial leverage is equal to EBIT divided by, instead of EBT, you will write EBIT minus interest. That we will apply in this question. That's all. So check this. But now you have to calculate this data for two companies. What is the requirement? You need to prepare a income statement. You need to prepare income statement for both the companies. You need to prepare variable cost they've given. Okay. So in these sort of question, the best thing is first make the format. Make the format. Income statement ka format. What is income statement ka format? Sales. Or don't write particulars amount. Here anyway they've asked for two companies. So first we will do it for company A. Particulars, company A ka income statement along with some workings. Because if it is simple workings, no need to prepare a separate working note. We will show it here only. Then same data you present it for company B as well. Parallelly we can do it. Format, sales minus variable cost gives you contribution. Contribution minus FOC, EBIT. EBIT minus interest, EBT. Minus tax, EAT. Minus preference dividend, income. And you can also present till EPS also if the data is available. Okay. Have this format. Whatever data they have given, first update that. Whatever data they've given to you in the question, plug that number. First, let's do it for company A. Check what and all they've given for company A. They've given what for company A? They've given variable cost. Keep this number, mental note you keep. Variable cost how much? 88. Fixed cost how much? 26,500. Interest expense how much? 14,000. Tell me this data. 88, 26,500 and 14,000. Variable cost is given in the question to be 88,000. Updated. This is for company A. Variable cost given. Okay now. One number done. Similarly, they gave you fixed operating cost of 26,500 given, updated. Then they gave you interest of 14,000. So these three data was what given to us in the question. Okay, sir. Now, very simple. Check. Sir, this is given. This is given. Can't you find out this? Now, if you don't put income statement, you will never be able to figure out contribution. Because do you know our contribution is given by the formula variable cost minus fixed operating cost. That will click no. But when you look at the income statement, if this is 88 and if this is 26,400 means you can figure out automatically the other one. Like this you can figure out, or maybe I'm just saying, I think I'm comparing wrong numbers. Anyways, like this you will be able to figure out few things with income statement. That's what point I'm trying to make. Okay, sir. First we will update this. Let's not jump. So three data they have given and three datas we have updated. Can I move forward to the next one? All right. Next to check for company A, what else they've given? What else they've given for company A? They have given financial leverage. I told you examiner's ka favorite point. Financial leverage is given. They can call it as 5:1. 5:1 is nothing but 5 divided by 1. 5 divided by 1 is what? 5. Either they will directly say it is 5, or another way of presentation is they will say 5:1, or they will also say it is 5 times. Also they will say it as 5 times. One and the same. Basically financial leverage is how much? 5. Financial leverage is given. Interest is given. What should click? The moment you see these two data, what should click? Substitution formula. Okay, so now that's what I've done here. Check. How do you get? You can, using this data you can get EBIT. Financial leverage is given by the formula EBIT divided by EBT. Instead of EBT I will substitute. What I will substitute? Instead of EBT I will write EBIT minus interest. Financial leverage is given in the question 5. EBIT we don't know. Interest is given in the question 14,000. So that means only component missing in this equation is what? EBIT. Solve the equation to get EBIT. Solving, I think I don't have to go further there. So when you solve, finally you will get EBIT how much, sir? 17,000. One number if you get means whole income statement more or less solved. Okay, here you got no. This is okay, no? Everybody cool with this? Now EBIT, how much did you get it, sir? 17,500. Okay, now it's very simple. Sir, EBIT 17,500. Fixed operating cost is 26,500. That means what has to be contribution? Contribution minus fixed operating cost should get you EBIT. If this is 17,500, if this is 26,500 means contribution has to be addition of these two. Correct? No. That means how much is contribution? That's what I've done. 17,500 plus 26,500. It's a simple one. Should we have to present a working note or show it here only? Show it here only. Adding these two, you'll get how much contribution? 44,000. That way, figure it out. Okay, sir. Sir, this is 44,000. This is 88,000. This is 88,000. That means what should be your sales? Adding these two, you'll get 1,32,000. Because only if you do 132 minus 88, then only you will get 44. That way, till here, fully we have figured it out. Okay. They have asked income statement fully. So from EBIT, you have to reduce interest. Interest we have to find or given. EBIT, you know. Interest is already given 14. From EBIT, if you reduce interest, what are you going to get? Earnings before tax. Tax is given at 30%. So EAT also you can find out. Preference dividend is not there, so each also will become same. So only one thing you have to find out in this problem, that is your EBIT. Rest everything automatically fell. Okay, sir. Need a minute or okay? This is for company A. Now we'll have to figure out the same data for company B. First, have income statement ka format. Whatever data is given to you in the question, first update that in the format. That will help you to figure out the missing components. For company B, check what and all they've given. Interest expense they gave 11,000. EBIT they gave 14,000. 11 and 14. Interest expense is 11 and EBIT is 14. So 11 and 14. This 14 they gave. Interest expenses. These two data. These two they have given. Yes, sir, people. This is given means automatically this and all easily you can figure it out now. EBIT is 14,000. This is EBIT and this is your interest. From EBIT, if you reduce interest, what are you going to get? Earnings before tax. Tax rate is given in the question to be 30%. So reduce tax. You'll get earnings after tax. Preference dividend is not there. That means each is also known. So from here to here, you automatically found everything. Only thing you need to do is find out these components, these missing components. For that, we will see what data they have given. Check. What they have given. In the question, they have given margin of safety. Sir, you know this already. So margin of safety is given to be 0.25. Okay, sir, you know one connection. What is that connection? Sir, operating leverage is nothing but 1 upon margin of safety. So margin of safety is 0.25. Therefore, what is operating leverage? 4. Operating leverage is 4. Now everything damar. Why? Sir, operating leverage is given by the formula contribution upon EBIT. Sir, operating leverage, you know, EBIT is given in the question to be 14,000. So substitute. OL is 4 now. Contribution we don't know. EBIT is given to be 4. 14 4s are 56. So contribution is how much? 6,000. That's all. Updated. Okay, no. That's all. So now we got, that's what I've done here. Check. How much is that? Contribution we got it to be 56,000. Sir, this is given. This is given. Contribution is 56,000. That means what is fixed operating cost? This contribution is given. EBIT is given. That means this is balancing figure. No. How do you get that? 56 minus 14,000. You do it. You will automatically get fixed operating cost to be 46 or rather 42,000. Till here we have completed the whole income statement. Every number below this we have completed. Do you agree with me? The only thing we need to find out is variable cost and sales. For that, what info available? Check cheyali. Enna kuduthirukanga. Variable cost, they have given it as 50% kottidare macha. Variable cost is how much? Sir, from sales, if you reduce variable cost, you will get contribution. They are saying variable cost is 50% of sales. Sales is always represented on 100% platform. No, sales is always on 100% platform. And variable cost they're saying is 50% of sales. That means contribution indirectly will be what? 50% of sales. It's like telling like this. Okay. If sales is 1 lakh means how much will be variable cost? Variable cost is 50% of sales, which will be 50,000. That means contribution also automatically will be what? That means contribution and variable cost changing or same? Same. Do you know contribution? Yeah, just now we found out. How much is contribution? 56,000. If contribution is 56,000 means variable cost is also 56,000. Okay. So, and the sales will be balancing figure. This is also 56 and the sales will be addition of those two. Okay, Saru. Like that also you can do multiple ways to present the data. That's all is this question. You're looking at me like I'm going to say extra. Problem is over. Nothing extra. Over. Okay, people. Okay. Thank you for your lovely time and patience for today. The session is good enough. See you. Yes. Happy morning, people. So let's continue our revision series. So let's revise next topic, that is financial planning and analysis, that is, or also known as ratio analysis. Okay. So what is this ratio analysis? Simple, sir. To calculate a ratio, you take one number in the numerator and you take one number in the denominator. Okay. Just a simple number in the numerator divided by a number in the denominator will give you some ratios. Okay. Sir, can you take any random numbers in numerator and denominator? No. If you take a number in the numerator, its related number, you have to take it in the denominator. Like GP, can I compare it with creditors? Can I do GP divided by creditors? Is gross profit anyway linked with creditors or it is not linked at all? It is not linked at all. Okay. Or 1 second. Some settings they're doing it. One second. Team, I hope everything is okay. Online, can you quickly confirm? Is the audio part or video part okay? Everyone just quickly respond. It's fine, right? Okay, moving along. Sir, can gross profit be compared with creditors? Are they linked or absolutely no linkage? No linkage. So GP will compare it with the sales. So that's what I mean. If you want to do ratio analysis, you have to take one related number in the numerator and take its related number in the denominator. So why do we do this ratio analysis? Ratio analysis helps you in determining the strength and weaknesses of the company. Okay, your normal financial statements like P&L, balance sheet, cash flow statement won't give out certain information. Some extra strengths and weaknesses you can find out with the help of a ratio analysis. That's the reason we do it. Okay. In examination, usually they have around 8 to 10 ratios. They take that help and usually frame the questions. For the time being, quickly we will run through all the ratios, understand its meaning and calculation. Then we will apply it. Okay. All right. First set of ratios that we need to know is the liquidity ratio. Under liquidity ratio, first one is current ratio. Current ratio is given by the formula current assets divided by current liability. Ideally, current ratio should be 2. This ratio is trying to calculate whether do we have enough current assets to pay off current liability. Do we have enough current assets to pay off current liability is what this ratio is trying to test. Next is quick ratio, or also known as asset test ratio. So asset test ratio or quick ratio is given by the formula quick assets divided by quick assets divided by current liability. So how do you calculate quick assets? Simple. Take the current assets. From current assets, you reduce the inventory. If you have any prepaid expenses also, you need to reduce. But in our majority of the problem, prepaid expenses will not be there. So quick assets is given by current assets minus inventory. Because usually the thought process is inventory, we want quick assets. Inventory, can you sell quickly or it will take some time? It will take some time. Hence, from current assets, we eliminate inventory. If you do it, you will get quick assets. And this ratio is trying to test whether we have enough quick assets to settle current liabilities. So, ideal quick ratio should be 1. For 1 rupee current liability, you should have 1 rupee quick assets is what is the ideal number recommended. Alright. Next is cash ratio. Cash ratio is trying to test whether you have enough cash balance through which you can settle your current liability. Here cash refers to cash in hand as well as cash at bank as well as short-term investment. Numerator is cash in hand, cash at bank and short-term investments. Denominator is current liability. Okay, Zaro? Alright. Next is basics defense interval ratio. Basic defense interval ratio is trying to test if it's a doomsday, if it is doomsday, meaning if the company ka revenue stops, how many days can company survive? How many days can they meet their expenses? Let's assume that a whole year expense for a particular company is 365 lakh. For the entire year, operating expense for the company is how much? 365 lakh. In a year, how many days are there? 365. That means how much is operating expense every day? Operating expense per day is 1 lakh. Right? Operating expense per day is 1 lakh. Suppose company has cash balance of 25 lakh. Suppose company has a cash balance of 25 lakh. How many days can company survive if they don't get revenue? Sir, every day expense is how much? 1 lakh. How much cash the company has? 25 lakh. That means the business can survive for how many days? 25 days. Yes, people. Now express this in formula for me. How did you get this 25 days? 25 lakh divided by 1 lakh. What is that 25 lakh? Cash available. What is that 1 lakh? Operating expense per day. That's how you calculate basics defense interval ratio. So numerator is cash in hand, cash at bank plus short-term investment plus amount received from debtors, or rather debtors balance, divided by operating expense per day. If you do that, okay, so you will get something known as basics defense interval ratio. Alright. Next is net working capital. All these are not very important. Okay. Whatever ratio is important, you will get to know when we take up the questions. For now, quickly we are running through all the ratios. A quick revision. Okay. So don't worry, there are more than 30 ratios, but only 8 to 9 or 8 to 10 are roughly tested in the examination in different ways. Okay. These are just quick revision. That's all. Net working capital. So how do you get net working capital? Current assets minus current liability. Okay. Next is capital structure ratio. Alright, for under capital structure ratio, first ratio is equity ratio. So equity ratio is trying to test of your total capital employed, how much money has come through equity. Of your total money, how much money has come through equity. So this is given by the formula equity divided by capital employed. Equity here refers to equity share capital and retained earnings. or rather you can call it as reserves in surplus. In ratio problem, you will not have many reserves in surplus. Only one reserve you will have, that is retained earnings. Hence, you can call it as, so here the numerator will become what, sir? Equity share capital plus retained earnings or reserves in surplus divided by total capital employed. So this has many names. Equity share capital and reserves in surplus. Either you can call it as shareholders equity. Also, it is also known as net worth. Different names. The way of calculating is same. Equity share capital plus reserves in surplus, if you add, that number is also referred to as net worth. Capital employed ka another name is net assets. All this I've proved it to you with numbers. For now, we will just go ahead with the way the nomenclature is good enough. So capital employed ka another name is net assets. Okay, Saru? All right. Next ratio is trying to debt ratio. Debt ratio is trying to calculate out of the total capital employed, how much money has come through debt. So tell me the formula for debt ratio now. So no, debt ratio. Total debt divided by total assets. Capital employed, meaning out of your capital employed, how much money has come through debt is what we are trying to test. When we say total debt, it means long-term debt as well as short-term debt. Divided by, either you can call it as capital employed, or capital employed ka another name is net assets. This is okay with you? So basically this ratio is trying to test of your money. It's like this. Okay, suppose you have taken a borrowings of your capital employed is 100 lakh. Your capital employed is 100 lakh. In that 100 lakh, 20 lakh is come through debt. So what percentage of money has come through debt? 20%. This is what debt ratio is trying to calculate. Understood, everybody? That's all it is. Okay, I think I'll go for this one. This is better. Okay, cool with this so far? Okay, next is debt to equity ratio. Debt to equity ratio is trying to measure the relationship between debt and equity. We already calculated in one of the problem, capital structure wala problem. How do you calculate debt equity ratio? Tell me. D divided by D plus equity, right? That was debt divided by debt plus equity, specifically that told. Here we are only trying to measure the relationship between debt to equity. That means the formula will be what? Numerator will be debt. Denominator will be equity. Equity ka calculation is equity share capital plus reserves and surplus, also known as net worth. Like that. Okay. And debt here includes both long-term debt as well as short-term debt. But usually for all our problems, we only take long-term debt in the numerator. Okay. But as such, the ratio considers both long-term and short-term. But for question, we prefer to take long-term debt in the numerator divided by net worth or equity in the denominator. Any doubt so far, or can I move forward so on? Can I move on so on? I mean everyone, cool, no? Okay, next one is debt to total asset ratio. This ratio is trying to test, sir, to buy assets we need money. To buy any assets we need money. This ratio is trying to test how much assets has been purchased using debt. How much assets has been purchased using debt. The name only, there is a formula. Debt to total assets. Tell me the formula. What is the journal? What's in the numerator? Total debt divided by total assets. Total debt here includes both long-term as well as short-term. Total assets here include both fixed asset as well as current assets. Okay, G? Alright. Next one is capital gearing ratio. Little important ratio for examination. Of late 2-3 adjustments on this has been asked. Capital gearing ratio. What is capital gearing ratio trying to calculate is how much fixed cost instrument, listen to my sentence carefully, how much fixed cost instrument company is using to increase shareholders' equity. What did I say? Capital gearing ratio is trying to measure how much fixed cost instruments company is using to increase shareholders' return or shareholders' equity. Okay, stop, sir. Tell me, what is the breakup of capital employed? Do you know this? Capital employed means capital or total funds. Yesterday only we discussed capital structure problem. Capital employed means what, sir? How do you get capital employed? Equity share capital plus reserves and surplus. Only one reserves and surplus that usually we will have. That is what, sir? Usually only one reserves and surplus, that will be retained earnings. Plus, you can also raise the money through preference share capital. You can also raise the money through long-term debt. All this, if you add, you will get something called capital employed. Okay, Saru? Everyone cool? Now, capital gearing ratio is trying to measure, what did I say? How much fixed cost instrument company is using. Now, in this instrument, which has fixed cost? Can you tell me? On equity share capital, do you pay fixed rate of dividend? No. On reserves and surplus? No. These two are anyway linked. On preference share capital and long-term debt, you pay fixed cost. Yes, no, that means fixed cost instrument means what? Preference share capital and long-term debt. So capital gearing ratio का numerator is what? Preference share capital plus long-term debt. Okay, so capital gearing ratio ka meaning is what? Using fixed cost instrument to increase shareholders equity. How do you calculate shareholders equity? Equity share capital plus reserves and surplus, or you can also call that to be net worth. So basically capital gearing ratio is given by the formula preference share capital plus long-term debt in the numerator divided by net worth in the denominator. Okay, sir. So that's the way to calculate. Or how does using fixed cost instrument increase shareholders equity is like this. Let us say, sir, okay, company first year they've generated a sales of 10 lakh. Okay, company has taken a debt. On that debt they have to pay interest in the first year. How much? 1 lakh. That means how much is profit before tax? 9 lakh. Let's assume that preference share capital is not there. Tax is also not there. Assumption. Tax is how much? 0. Preference share capital is also 0. That means this is PBT. PBT only becomes PAT. PAT only becomes EAT. So far good. Okay. So in the first year, company has taken a debt. Okay. Now second year, now sir, bumper from 10 lakh sales became 60 lakh. Will interest change or interest is same? On your bank loan, debentures and all, interest, if sales increases, you will pay more interest or same interest? So next year also interest will be same. Now look at Ish. How much is Ish? 59 lakh. First year it was 9. From 9 straight away jumped to 59 lakh. Why? Because on fixed cost instrument, do you pay more interest because of more sale or same interest? Same interest. By using fixed cost instrument, from 9 lakh Ish, it became 59 lakh Ish. This is what is capital gearing ratio. Okay, using fixed cost instrument to increase shareholders equity. Meaning you don't need it. You need to know the calculation for examination. I hope this is okay so far, everybody. Can I move forward to the next one? Online also good. Early morning, woken up people. Online on the message aake guru. It's okay. You can just walk in. That's absolutely okay. Anyone who comes a little late, just walk in. No problem. Okay. Next is proprietary ratio. Proprietary ratio is trying to calculate. Sir, you need to buy assets. We need money. Proprietary funds is trying to calculate how much proprietary funds is used to buy assets. How much proprietary funds is used to buy assets. So that means the numerator will be what, sir? Just like debt to total assets ratio, here it is proprietary fund ratio. Proprietary fund ratio is given by the formula proprietary funds divided by total assets. Sir, who is a proprietor? Proprietor means owner. Proprietors means obviously owners. For a company, who's owner? Only equity shareholders or also preference shareholders? Sir, shareholders are owners of the company. In company, how many types of shareholders are there? 2. Equity shareholders and preference shareholders. Now tell me how to calculate proprietors funds now. Equity share capital plus reserves and surplus. This belongs to equity shareholders plus what? Preference share capital. So if you do this, you'll automatically get proprietors funds. So basically the formula is proprietary funds are divided by total assets. This ratio is trying to calculate how much proprietary funds is used to buy the total assets. So there is another way to calculate proprietary funds. I'll prove it to you in one of the problems. For now, I'll just call it out. Proprietary funds ka one way of calculating is equity share capital plus reserves and surplus plus preference share capital. Or another way is from the asset side. Asset side mein what and all assets will come? Fixed assets and current assets. On the liability side, you will have long-term debt and current liability. Sir, current assets minus current liability, if you do, what you will get? Net working capital. So proprietary ratio is given by one more formula, fixed asset plus net working capital minus long-term debt if you have anything. This is another way because sometimes they give you this information, net working capital information in the question. Hence, to find proprietary funds, we may use this particular equation. I'll prove it to you with one of the balance sheet in the question. For now, don't have to worry. So there are 2 ways to calculate this proprietary funds. Even this is also little important for examination. Okay, Saru? All right. Next one is interest service coverage ratio. Interest service ratio, coverage ratio is given by the formula EBIT divided by interest. Okay, suppose company has EBIT of 10 lakh. Interest is 1 lakh. So do 10 lakh divided by 1 lakh. How much are you getting? 10. What this interest coverage ratio is trying to calculate is how much profit the company has to pay interest. How much profit the company has to pay interest. When you calculated here, what did you get, sir? 10. That means what? Company has enough profits to pay 10 times the interest. Company has enough profit to pay 1 year interest or 10 year interest. Company has enough profit to pay 10 year interest. Now you tell me, this coverage ratio should be on the lower side or higher side? Suppose you have given a loan to the company. You have given a loan to the company. On loan, how much interest you are collecting from the company? 1 lakh. Company has 10 lakh profit. You will be sad or happy? Happy, because you have to collect interest from the company only 1 lakh. And company has a profit of 10 lakh. That means company has enough profit to pay you 10 years interest. That means you will have a big smile on your face. That means everything going smooth. So this coverage ratio should always be on the higher side. Okay, Saru? Alright. Next is preference dividend coverage ratio. So the same lines, build the formula. What is interest coverage ratio ka formula? We want profit before paying interest. We want profit before paying interest. That only we call it as EBIT divided by interest. Similarly, preference dividend coverage ratio. Sir, using EBIT, can you pay preference dividend? No. From EBIT, you have to reduce interest. You will get what? Earnings before tax. Can you use EBT and pay dividend, or first you have to pay tax? From EBT, reduce tax. You will get what? Earnings after tax. Now, earnings after tax, can you use for preference dividend? Yes. So, instead of EBIT, the numerator will become what, sir? Earnings after tax divided by interest of preference dividend. Since we are calculating preference dividend coverage ratio, the formula will be profit after tax or earnings after tax divided by preference dividend. Done. Okay. Similarly, you can also calculate equity dividend coverage ratio. Tell me, equity dividend coverage ratio. Can we use earnings after tax to pay equity dividend? No. From earnings after tax, first you have to reduce what? Preference dividend. Then you will get what? Each. Is each available for dividend declaration? Yes. That means the numerator will become what? Each. Divided by denominator, that is equity dividend. That way you will get equity dividend ka coverage ratio. Even coverage ratios are sometimes asked in the examination. Okay, even coverage ratio could be taken as important. Alright, this is not required, it's okay. Alright, next is turnover ratio. Sir, turnover ratios are important for examination. Okay, we have 5 to 6 turnover ratio. At least 1 or 2 will definitely come in your most of your ratio question. At least 1 turnover ratio usually will be given. More than 1 usually, but at least 1 will turn up. Okay, turnover ratio, or also known as efficiency ratio. Right? These are trying to measure the efficiency of the organization. How efficiently company is using their assets, how efficiently company is using their capital, etc., etc. That is what efficiency ratio or performance ratio is trying to measure. Okay. All right. First turnover ratio is, name is what, sir? Total asset turnover ratio. Sir, in the name only there is formula. Don't look at the formula. You tell me the formula here. Total asset turnover ratio. So that means looking at that line, what should be the numerator? What should be the denominator? Looking at this word, first asset is coming, then turnover is coming. So ideally, what should be the formula? Assets divided by turnover. Ideally, the formula should be asset divided by turnover. Okay. Sir, let us say we have invested in assets worth 10 lakh. Company has purchased assets worth 10 lakh. Using, sir, if we buy laptop and all, if ArivuPro, if we invest in laptop or iPad or AC and all, what will we use this for? To conduct classes. When we conduct class, what will we get? Money. Yes, revenue. Let us say we generated a revenue of 15 lakh rupees. We generated a revenue of 15 lakh. Calculate this number. How much are you getting? 10 lakh divided by 15 lakh. Quickly tell. 10.67. Correct? Okay. Now you tell me, sir. You have generated how much? How much you're getting? 0.67. Sir, you tell me, am I using, if this is a scenario for ArivuPro, okay, are we using our assets efficiently or not efficiently? Sir, we invested 10 lakh in our assets. From our assets, how much revenue are we generating every year? 15 lakh. I mean, this is bad scenario or good scenario? Good scenario, but you are getting 0.67. That means if you calculate like this, it looks like this. You have invested 1 rupee. This efficiency ratio is trying to calculate how efficiently have you using your assets. Okay. If you do this, you are getting 0.67, means it leads to an indication that if you invest 1 rupee in assets, if you invest 1 rupee in assets, you are getting you are generating a revenue of 0.67. For 1 rupee investment in asset, you are generating a revenue of 0.67. Is that the scenario or ulta? Sir, I am invested only 10 lakh in my asset and I am generating how much revenue? 15 lakh. That means, should this be the formula? No. Actual formula should be what, sir? Do the ulta. It's not assets divided by turnover. Take it as what? Turnover divided by total assets. That is a formula. If you recalculate this, how much it will be, sir? If you take turnover divided by assets, how much you will get? 15 lakh divided by 10 lakh. That will get you how much? 1.5. And this is good. Yes or no? Because I have invested 1 rupee in my assets. If I invest 1 rupee in my assets, how much revenue will I generate? 1.5. So that is what we are trying to measure. Hence, or a quick way to remember the turnover ratio is, whenever they ask you turnover ratio, always take turnover or sales in the numerator and the other component in the denominator if you get confused. Or one quick easy way to remember it. For any turnover ratio, the sales should come in the numerator and the other component should come in the denominator. So if it is asset turnover ratio, the formula will be sales divided by assets. Sales divided by assets. Sir, suppose sales information, if it is not given in the information, the next best information you will use is COGS. Sales is always the first priority. If sales is missing, then you will take the second priority item, which is COGS. Okay. Similarly, in denominator, company will buy the assets only one day, only once in a year, or they will buy throughout. That means you tell me. And revenue also company will generate one day or throughout. Hence, the denominator should be what, sir? Ideally, the denominator should be average assets. Because assets will not be purchased once. Asset will be purchased throughout. Hence, the denominator ka first priority is average assets. So, to calculate average asset, you should know one information or two information. What is that two information? You need to know opening balance of asset and closing balance of assets. Suppose they don't give you opening balance. They only give you closing balance. Means, can we calculate average? No. If average information is missing, then you will take a closing balance of assets in the denominator. This is how to calculate. First priority for average asset. If you are not able to calculate the average, then you will take the closing balance of asset as a denominator. That's how to calculate the turnover ratio. Done, everybody? Can I move forward to the next one? Okay, next one is, okay, one if you have got, other 2, 3, you will tell for me. Fixed asset turnover ratio. Tell me, sir. Fixed asset turnover ratio. Formula you tell. Sales divided by fixed assets. Okay, first priority in the numerator is sales. Sales missing means COGS. Denominator ka first priority is average fixed asset. If average is missing means closing balance of fixed assets you take. Same ground. Okay. This ratio is trying to calculate how efficiently company is using their fixed assets. But okay, if they invest 1 rupee in fixed asset, how much revenue that company is able to generate. That's what this ratio is trying to calculate. Move on to the next one. Okay. Next one is capital turnover ratio. Tell me the formula. Capital turnover ratio. Given by the formula, sales divided by capital employed. Okay. First priority for sales. Sales missing means you will take capital. Sales missing means you will take COGS. Denominator mein you will take capital employed. Usually average capital employed will not be given. Hence you will take closing balance of capital employed. Capital employed ka another name is also net assets. That also can be taken. Alright, next is working capital turnover ratio given by the formula. In fact, capital turnover ratio is trying to measure how efficiently company is utilizing their money. Because to run the business, we need money. Correct? No. Now, for us to open this Coimbatore branch, we needed money. Now, how efficiently did we use that money is what we are trying to measure in capital turnover ratio. Okay, that's all it is. By using their capital, how much revenue the company is able to generate. Similarly, working capital turnover ratio is given by the formula. What? Sales divided by working capital. First priority for sales, next priority for COGS. If COGS sales is missing, then only you will take COGS. Divided by denominator, working capital. Move on to the next one. Okay, next is inventory turnover ratio. Inventory turnover ratio, for class purpose, we'll call it as ITR. Tell me the formula again. Don't look at the screen. Inventory turnover ratio given by the formula. Ideal formula. What is your mind saying? Sales. So divided by average stock. Oh, if average stock is missing, you will take closing stock. Right? But hang on. Sir, is inventory measured? You know, you have studied basics of accounts at least. Although accounts comes in your group 1. We have studied. Inventories are measured at selling price or cost price? Cost price. That means for inventory, first priority should be sales or COGS? COGS. That means the numerator for inventory turnover ratio is first priority always for COGS. If COGS information, if it is not given, then you will use the next best information, which is sales, divided by average stock if information is available. Otherwise, you will take a closing stock. Move on, people. All right. Suppose inventory turnover ratio is 6. We calculated inventory turnover ratio and we got it to be 6. What it means is, all right, how many times, if inventory turnover ratio is 6, that indicates that company is able to sell their inventory 6 times in a year. Company is able to sell their inventory 6 times in a year. So we want inventory turnover ratio and all to be on the higher side. Okay. Now using inventory turnover ratio, you can calculate something known as inventory velocity. Using turnover ratio, we can always calculate another number called inventory velocity, or forget about that for formula. Just take the help of this. Inventory turnover ratio is how much? In my example, 6. What it means? What it means? Company is able to sell their inventory 6 times a year. That means on an average, for how many months is company holding their inventory in their company? On an average, company is holding their inventory in their factory for 2 months. How? Sir, 6 times in a year if you are able to sell means how many months are there in a year? 12 months. So 12 divided by 6 you do. How much you going to get? 12 divided by 6 is how much? 2. On an average, company is holding their stock for 2 months. Okay, that way you will be able to sell the inventory 6 times. This only is what we call it as inventory velocity or inventory holding period. Tell me the formula now. How did you calculate? How did you calculate 2? You tell me. You took 12 divided by 6. What is that 12? Number of months in a year. That's your numerator. Divided by 6. What is that 6? Inventory turnover ratio. Tell me the inventory ka velocity ka formula once again. Numerator is, or you tell me this one only. Either it is 12. Sometimes they may give the data in months. Sometimes they can also give it in weeks or in days. That means the numerator will either be 12, 365 or 52 divided by inventory turnover ratio. That way you will get inventory ka velocity. Okay, people. Inventory velocity simply means on an average, for how many months is the company holding on to their stocks? They're keeping the stocks in their factory for how many months? That's what inventory velocity is trying to calculate. Move on. Correct. Okay. Next is debtors turnover ratio. And tell me the formula, sir. Debtors turnover ratio. Formula is what? Sales divided by average debtor. 1 second, hang on. Is debtor, see, ratio analysis means can you take random number or related numbers? Related numbers. Sir, is debtors associated with the total sales or credit sales? I mean, what should be your numerator? Credit sales divided by average debtors. If average is missing means you will take a closing balance of debtors. Okay, people? And moreover, here debtors, no, it's actually not debtors, it is accounts receivable. It is accounts receivable. Accounts receivable means debtors and bill receivable put together. But in majority of the problem, bill receivable data will not be given. That's the reason we say the formula credit sales divided by debtors. But actually, it's better to say the formula to be credit sales divided by average accounts receivable. Because in some problem, they will give you BR. They'll give you bill receivable. So that way you should be a little careful. One problem, I'll take it up on this adjustment also. Done, sir? Okay. Sir, using debtors turnover ratio. Okay, let's take like this. Let's say we calculated debtor turnover ratio and we got it to be 4. What does it mean? What does it mean? We are able to collect from your debtors, you will collect money. If debtors turnover ratio is 4 means in a year, we are able to collect money from debtors 4 times. We are able to collect money from our debtors 4 times. That means how much credit period am I giving to my debtors? That only we call it as debtors velocity. Tell, how did you calculate inventory velocity? 12, 365, 52 divided by ITR. Debtors velocity, how do you calculate? 12, 365 or 52 depending on the data divided by debtors turnover ratio, which is DTR. 12 by DTR if you do, you will get debtors velocity. Debtor velocity is nothing but your average collection period. So, or credit period. So, if you calculate here, you are getting how many months? 12 divided by 4 if you do, you will get 3 months. So, on an average, you are giving a credit to the customers for a period of 3 months like this. So, one information if they give, this is also important. These data, as I told, every turnover ratio from ratio is very important. They will use 1 or 2, definitely will come in the questions. Which one will come? Difficult to say. Almost everything has been tested previously. So that's the reason you can keep everything as important. Okay, next one. Sir, payable turnover ratio. Tell me the formula, sir. Payable turnover ratio. Sir, now you will take sales. Sir, it is payable turnover ratio. Payable means creditor. Is creditor linked with sales? No. That means what you should take. Should you take sales in the numerator or purchases? That too, you should take full purchases or creditors associated with credit purchases. Credit purchases. So numerator will be what? Annual credit purchases divided by average accounts payable or closing balance of accounts payable. Okay. Accounts payable means creditors and bills payable put together. In majority of the problem, bills payable may not be there. But if it is there, you have to be a little careful. Okay, Saru? This is your payable turnover ratio. Same payable turnover ratio. If you get the payable turnover ratio as 6, that means what? If PTR is 6, if you calculate payable turnover ratio and if you get it as 6, what it means? In a year, we are paying the creditor on average 6 times a year. We are paying the creditor how many? 6 times a year we are paying. That means, can you calculate payable velocity for me? Payable velocity, can you calculate? How do you calculate velocity? Velocity means holding period or credit period. How do you calculate that? 1252 or 365 divided by payable turnover ratio. Okay. Usually the data will be given in months. Usually. So assuming that this data is given in months, 12 divided by 6 if you do, how much you're going to get? 2 months. So on an average, we get how much credit period from our creditors? 2 months. That's all this ratio is trying to calculate. Okay, this is done. Need a breather or next? Easy? Okay. Next one is profitability ratio. First one is GP ratio. GP ratio, this and all you already know. GP ratio is given by the formula GP upon sales into 100. Net profit ratio given by the formula net profit divided by sales into 100. Operating profit ratio. Operating profit only we call it as EBIT. Operating profit ratio is given by the formula EBIT upon sales into 100. So should we have to remember ratio formula, sir? Absolutely yes. Don't even ask any question. Should we remember this or that? Okay, you have taken one course called CA where they will test you everything. Your memory, your application, your skill set. All the things are tested. Okay, so goes without saying you have to remember everything. It will not be. The formula will not be given. You have to remember it. Okay, next one. Alright. See, cost of goods, COGS ratio. COGS ratio is given by the formula. It's basically trying to calculate what percentage of sales constitutes COGS. So given by the formula COGS upon sales into 100. Next, operating expense ratio. Sir, administrative expenses, selling and distribution expenses is referred to as operating expense. So operating expense ratio is given by the formula. Numerator may it will be administrative expenses plus selling and distribution overheads divided by sales into 100. Okay, this is one. Then watch out for this. This is operating expense ratio. Next, they give you something called operating ratio. This is important. Operating ratio. Sir, to run a business, will you incur only operating expenses or you'll have to also incur direct costs like COGS? COGS is also required. Operating expenses also required. Operating ratio is given by the formula to generate revenue. Totally how much operating expenses I have to incur. To generate revenue, what is the total operating expense you need to incur? To generate operating expenses, you will have to incur only indirect cost or even direct cost also. Direct cost. Direct cost we captured in COGS. So tell me operating ratio ka formula. COGS plus operating expense divided by sales into 100. That way if you do, you will get something known as operating ratio. Okay people? Okay sir, you know this formula. From another way, from sales, if you reduce COGS, what are you going to get? And this another way of presentation. From sales, if you reduce COGS, you will get gross profit. From gross profit, if you reduce operating expense, you get something called EBIT. Another way of representing income statement. Yes or no? Correct? Correct. Okay. Sir. These two put together becomes your COGS and operating expense totally becomes your total operating expense. Okay. From sales, if you reduce the total operating expense, automatically what are you going to get? EBIT. Yes, no people. From sales, if you reduce COGS and if you reduce operating expense, automatically what are you going to get? EBIT. Okay. Indirectly what I'm trying to say, sir, if they say in the question, this is a popular adjustment once it has come in examination. Sir, if operating ratio is 85%, if operating ratio is not operating expense ratio, if operating ratio is 85%, what it means? Operating expense means total operating expense. Operating expense, how do you calculate operating expense? Tell me. COGS plus operating expense will be equal to what, sir? 85% of sales. That's what this ratio is trying to calculate. If operating ratio is 85%, means indirectly we are trying to say COGS plus operating expense is 85% of sales. Sir, from sales, if you reduce COGS and operating expense, what will you get? EBIT. Sales is 100%. If these two put together are 85%, means indirectly what, sir? EBIT is 15% of sale. This is a good adjustment, has been asked 1 or 2 times already. Yes, everybody. So if operating ratio is 85%, means in 100 mein se minus 85 you do. 100 minus 85 is how much? 15. So if operating ratio is 85% of sales, means EBIT will be 15% of sale. We will apply this also in one of the question. But I hope it is making sense till now. Correct, G? Okay, move on, G. Financial expense wala ratio, not that important. Given with the formula, financial expenses divided by sales into 100. Financial expense means your interest. On your debentures, you have to pay interest. On bank loans, you have to pay interest. All that only is referred to as financial expense. Not that important, so it's okay. All right, moving along. So next 1 or 2 more ratios are there. Quickly we will review that and then we will dive into the question. Sir, after this ratio, I will give you probably a breakfast break. We will take a break and then we will take up the next topic. Today will be an early break, in case you're wondering. Okay. All right. Next is something known as return, profitability ratio on overall return. Return on investment. Return on investment. So there are 3 returns on investment. 3 types of return on investment. One is ROAS, which you're already comfortable with. Another one is return on equity. Another one is return on assets. Any of the return on investment, all these 3 put together or return, all these 3 only we call it as return on investment, or rather return on investment are of 3 types: ROAS, ROE as in ROE, and ROA, ROA, return on assets. ROAS, you tell me, sir, you know the formula for ROAS. ROAS, EBIT, return on capital employed. ROAS is given with the formula EBIT divided by capital employed into 100. Sometimes they tell you in the problem, calculate ROAS on an after-tax basis. Calculate ROAS on an after-tax or post-tax basis. Sir, in our FM, to get an after-tax number, we have a shortcut. What is that? Simply multiply 1 minus tax rate. When you do 1 minus tax rate, automatically you get after-tax. Now, if you have to calculate ROAS on an after-tax basis, refine the formula, don't look at the screen. ROAS on an after-tax basis you need to calculate. EBIT you will take, or EBIT into 1 minus tax rate. EBIT into 1 minus tax rate divided by capital employed into 100. That's it. So check the question, what they've asked, accordingly do it. Sir, if they don't mention whether ROAS is on a pre-tax basis or a post-tax basis, I say in some problems where what they do is they calculate both. They calculate both. Let examiner choose whatever they want. If they mention pre-tax, do it on pre-tax. If they mention on an after-tax or post-tax, means use this. If they don't mention anything, calculate of both. Let examiner choose whatever they want to be on the safer side. All right, this is done. Next is what's a return on equity. Return on equity. Tell the numerator. Sir, is EBA, return on equity means we are talking about return for equity shareholder. Is EBIT available for equity shareholder or what is available? Each. That means tell me the formula for ROE. For ROAS, it was EBIT divided by capital employed. For return on equity, instead of EBIT, what you will take? Instead of EBIT, you will take each, or also known as net income. Divided by denominator, you will take total capital employed or equity. Equity. How do you calculate equity? Equity share capital plus reserves and surplus. Another name is net worth. Okay. This way you will do, you will get the return. So return is always expressed in percentage, hence we multiplied by 100 finally. Next one. Okay. Next is EPS. This you already know, sir. How do you calculate EPS? Each divided by number of equity shares. Next, dividend per share. Dividend per share. How do you get dividend per share? Take the total dividend and divide by the total number of equity shares. You will get the dividend per share. Okay. Next is payout ratio. Sir, whenever payout comes, payout ratio is always expressed on EPS. Payout ratio is always expressed on EPS. So if they say in the question dividend payout ratio is 40%, it means what? If they say dividend payout ratio is 40%, it means what? 40% of EPS company is planning to distribute as a dividend. That's what it is. Payout ratio is always expressed on sales. Okay. Now tell me, sir, how do you calculate this dividend payout ratio? Payout ratio is always expressed on EPS. Hence, dividend payout ratio is given by the formula DPS divided by EPS. Okay, if you want it on you can calculate this on a per share basis, or you can also use total also. If you want, you can calculate dividend payout ratio in another way also. Total dividend divided by total earnings. You will get the same answer. Or you can take dividend per share divided by earnings per share. It's a very simple. Here, just check. So let's say company has earned a EPS of 10 rupees. EPS is how much? 10 rupees. Company gave a dividend of 4 rupees. So how much percentage of earnings has the company given? 4 divided by 10 into 100, if you do, automatically you will get 40%. So that's how you calculate dividend payout ratio. DPS divided by EPS. Carry on. Alright. Next one is price earning ratio. Again, this we have already applied. In name only there is formula. Price earning ratio given by the formula MPS divided by EPS. Awesome. Yield. Next is yield. A simple way to remember, yield means market price. When an yield comes in the ratio, yield is a number always expressed on market price. So when yield comes, MPS will always be in the denominator. Whichever yield ratio comes in, market price per share will be in the denominator. A quick fix. Now tell me, that way you tell me the formula for dividend yield. What is the dividend yield ka formula? Dividend per share divided by market price per share. Okay, or sir, dividend is a return for shareholder. Do you agree? Dividend is a return for a shareholder. Let us say, sir, you will get dividend. Sir, any Tom, Dick and Harry will get dividend, or you need to have that share? No, okay. What's your name, Macha? Saran. Saran. Saran, you have Reliance ka shares, sir? Okay. Sir, Saran doesn't own Reliance ka shares. Will he get Reliance ka dividend? No. If Saran has to get dividend for Reliance, means first he need to buy Reliance ka shares. Let us say he paid 100 rupees and he purchased Reliance ka shares. And Reliance gave him a dividend of 5 rupees. Reliance gave him a dividend of 5 rupees. Tell me, how much is the return for Saran? Return for Saran. How much did Saran invest? 100 rupees. How much money he got? 5. That means what is the return he is getting? He invested 5 rupees in the current year and he got back from the company how much? 5 rupees. So how much return? 5%. That's only we call it as a dividend yield. Dividend yield given by the formula DPS divided by MPS. Similarly, you calculate earnings yield for me. What is earnings yield ka formula? EPS divided by MPS. For any yield, MPS will come in the denominator for easy remembrance sake. Okay, you have a macha, you keep it. Great. Next is market value book value ratio. Name itself, there is a formula. Market value book value ratio given by the formula market value per share divided by book value per share. Okay. Sir, in the books, will we present the data on market value terms or historical cost terms? You have all done the accounting. Sir, if you purchase land for 10 lakh, how much will you show the land at? 10 lakh. But its market value may be 10 crore. You have purchased it for how much? 10 lakh. That means you are showing that land in your books at 10 lakh. But its market value after 3 years may be 10 crore also. But in our books, you will show what value? 10 lakh. That is your book value per share. Using your financial statements, we will calculate book value per share. But using market data, we will calculate market value per share. Market value per share, you can take it as stock market price. Book value per share is nothing but if you remember amalgamation, we have calculated net asset per share. If you remember advanced accounting, that you can call it as book value per share. Anyway, those are not much relevant over here. So this is how you calculate. This is more relevant for public sector companies. Okay, I think let's not go into too much of that. It's not much relevant for examination. Okay, now calculation is good enough. Next one is Q ratio. Q ratio, not that very important, but quickly we'll run through. Q ratio is given by the formula market value of equity and liabilities divided by replacement cost of asset. Sir, at some point of time, every asset you have to replace. Now we have purchased this iPad and all. Will it come forever? No. After 3 years or 4 years, we have to sell this and buy a new one. We have to replace this. For that, we need money. How will we get the money from? Either by issuing equity shares or by issuing debt. That is what Q ratio is trying to calculate. What is the market value of equity and liabilities versus what is the replacement cost of assets? Okay, so that is given by Q ratio. What is Q ratio's ka hypothesis or analysis is? This is the analysis point. I think once they had asked this. If Q ratio is 1, if you calculated Q ratio, if you get exactly 1, then we say share is the stock market ka or the share is fairly priced. Share is not overvalued nor it is not undervalued. It is fairly priced. If Q ratio is greater than 1, we say shares are overvalued. If Q ratio is less than 1, we say shares are undervalued. This is a significance. Just know as an MCQ question, 1 or 2 marks by chance if they ask. Doubtful it will get targeted in bigger question, but anyways. Carry on, G. Okay, this is Q ratio. Next is dew point model. Dew point model is like this. Normally, sir, you eat like this. Dew point model is eating like this. Calculating the same way, but through a weird route. That's all. That's all is dew point model. Okay, sir, you can calculate rows using dew point model. Sir, what is the normal formula for rows you tell? Rows you know. EBIT divided by capital employed. Okay, no. Our dew point, sir, no, doesn't like this. He doesn't like going straight. You're like, no, I will go like this, sir. Okay, so as per dew point model, rows is given by the formula operating profit multiplied by capital turnover ratio. Operating profit multiplied by capital turnover ratio. Do it. What do you call it as operating profit? EBIT. So operating profit how do you calculate operating profit? EBIT divided by sales. How do you calculate capital turnover ratio? Sales divided by capital employed. Sir, this sales will get cut. What remains? EBIT divided by capital employed. What is the formula to calculate rows? EBIT by capital employed. So instead of directly doing this numbers and calculating, you are using these two and calculating rows. That is your dew point model. Also popular in examination. 1 or 2 times has come. Okay. So this is how you calculate rows as per the dew point model. Given by what? Operating profit multiplied by capital turnover ratio. Okay. They will give you these two data in the question and ask you to find out rows. Okay. So this data will not be available. These two data will be available. So using this, you need to calculate. Similarly, using dew point model, you can also calculate return on equity. Sir, what is a normal way to calculate return on equity? Each divided by equity, or you can call it as net worth. Yes. So are you going this way? No, you are doing full circus. So as per dew point model, return on equity is given by, here you used what ratio? Operating profit. Next one, after operating profit, you will get net profit. So here you will use net profit ratio. Okay. Here you will use what ratio? Capital turnover ratio. Here you will use asset turnover ratio. So as per your dew point model, return on equity is given by the formula net profit margin multiplied by asset turnover ratio multiplied by equity multiplier. Okay. Now let's calculate. It's okay. No need to freak out. How do you calculate net profit margin? NP divided by sales into 100. Sir, how do you calculate asset turnover ratio? Sales divided by total assets. Okay. Now check, sir. This sales cut. Okay. We need what for our return on equity? We need each and capital employed. So finally, you need to multiply something. That's multiplying something only. We call it as equity multiplier. Now you tell me, how do you calculate equity multiplier? Check the question. Right now we have total assets. We have total assets. For your return on equity, do we need total assets or not required? Not required. That means this as total assets should be there or it should be cancelled. It's there in the denominator. How do you cancel it? You have to put it in the numerator also. Yes, no. But what do we need in the numerator? What do we actually need in the denominator? Equity. So equity multiplier is given by the formula total assets divided by net worth. So this way, if you do, what happens? This total assets will get cut. What remains basically? Net profit divided by equity. So in these sort of problem, net profit means PAT. Net profit means PAT. But in these sort of problem, preference shares will not be there. If preference shares is not there, means PAT and each are same. That way, you will be able to calculate return on equity using dew point model. You will have to remember them because they will give you this particular data in the question. Okay, they will give you that data. So you will not be able to calculate return on equity directly here. You will have to compulsorily use this only and calculate. Again, how do you get return on equity as per dew point model? Net profit margin multiplied by asset turnover ratio multiplied by equity multiplier. If you're getting confused, construct your own formulas. What you need versus what is available. Accordingly, you can construct your own numbers there. Okay, this is also done now. Next, I think done. That's it. Over. All the conceptual revision of ratio is done. Now we'll have to dive into the questions. So are we fairly comfortable? Can we move on? So no need for recap of any ratios. We remember. Can we directly go in? It's not necessary to remember everything. Only 8 to 10 ratios, if you remember, in my view, they are sufficient. Okay, but if you want to play it safe, better remember everything. That's all it is. Okay, now the questions we will see. Sir, ratio question is like Sudoku. You know Sudoku? You play Sudoku, no? So what do you do there? Try to find the missing numbers. Ratio questions are like that in examination. That's the way usually ratio questions ask. They will give you some data will be missing. You will have to figure out that missing data, and either they will ask you to calculate the balance sheet. They'll ask you to prepare balance sheet, or they may also ask you to prepare income statement. Usually for leverage, they try to ask the income statement. For ratio, mostly they will ask you to take the help of ratio and construct a balance sheet. That's how. It's a missing information. So everybody will get answer to ratio question. But the only thing is, will you answer within the time? So all these are a little bit of a time wasting questions. Okay. So watch out how much time you are taking. So don't take your own sweet time. Alright. Then it will be like paper only go. So watch out. It will waste you some time. Ratio. Some data you may not get it. They will give you one or two new adjustments here. So be very clear at what time you started and how much time you have allocated. And if you are not able to solve within that stipulated time, leave 1 or 2 pages and move forward. At the end of it, when you have time, you can come back. Okay. Because the first priority is completing the paper. First priority, first goal should always be like that. Okay. Have that heart. They say, be a stone. Right. When it comes to examination, you should be stone hearted. You should not let feelings and all come between. Oh, I know this question. Another 5 minutes now. Please, oh, please. Like that, people convince themselves only. Instead of 5 minutes, they take up 15 minutes, 20 minutes and paper gone. So please be very careful. As I said, with respect to time, absolutely in life, there should be no compromise attitude. You should, indirectly I'm telling, tomorrow come on time. Late like this. Okay, online also. Okay, carry on. Now the question part, we will take it up. Check here. From the following information of a company, prepare a summarized balance sheet. So we'll have to prepare balance sheet. Let's check. They've given net working capital. So how do you get working capital? Current assets minus current liability. Sir, the moment they give you net working capital, suddenly make your eyes big. They will also give you another related number. They will give you current ratio. Usually this is a popular adjustment. Net working capital and current ratio. This is a good connection question for ratios. Okay. Have they given current ratio? Yes. 2.5. First, I'll read off the question. Then they've given bank overdraft, fixed assets to proprietary ratio. Sir, there are 2 ways to calculate proprietary ratio. Bring back my memory. Proprietary ratio means what? How much proprietor fund is used to buy total assets. Proprietary, who is a proprietor? Only equity shareholder or also preference shareholder? Proprietor means owner. Hence, proprietary ratio ka one way of calculating is equity share capital plus reserves in surplus plus preference share capital. This is from the equity liability side. We can also work from the asset side. What is that asset side? Fixed assets plus net working capital minus long-term debt. That's another way to calculate proprietary funds. And here net working capital is given to you in the question. So we will take that help and calculate proprietary funds. Done. Then they've given liquid ratio. So these two are also good connection. Current ratio and liquid ratio are good connection. If they've given these two means either you will be able to find out current assets or current liability or stock. Usually closing stock. If they've given these two means you can take their help and find out closing stock. They are a good connection questions. Okay. These sort of adjustments, these are random, sir. Ratios are absolutely random. Okay. Like this adjustment and this adjustment, they can put it in any ratio question. All right. So, but usually these two, they will collect in some question. They are good connecting questions. All right. This is the data they have given. We need to prepare balance sheet. So whenever a ratio question is given and balance sheet is being asked, first have balance sheet ka format. Always have balance sheet ka format. And whatever data they have given, first update that. So any balance sheet data currently have they given? Yes, they've given bank overdraft and they've given reserves and surplus. First tick off that. So where is that? Yeah, here bank overdraft is 80,000 and they have given reserves and surplus to be 3,20,000. Done, sir? Okay. One more point in ratio ka balance sheet question you need to remember is, sir, always have an inner column. Always have an inner column. Meaning, sir, all the components of current liability, first you write in the inner column. Total you write it in the outer column. This will help you to figure out some missing components faster. All the components first you write in the inner column. Total current liabilities you push it to the outer column. Same way, all the current assets first you write in the inner column. Total current assets you push it to the outer column. Why you do this? I'll tell you in first when I do 2-3 adjustments here. Can we do, so far are we good? These are the two things, do not forget it. First, have the format, and in that format, all the components first you show, especially current assets and current liability. First write it in the inner column. Total you push it to the outer column. Do not forget this. This is very important. Otherwise, you will go on in loop. Because few things you'll never be able to find out them unless you do this number. Okay. Let's start. First, they've given net working capital. How much is net working capital, sir? 4,80,000. They've given you current ratio. How much is that? 2.5. Remember that. Sir, how do you get current ratio? Quickly tell. Current assets divided by current liability. This is given to be how much? 2.5. Okay, let's substitute this now then. Current assets, current ratio is 2.5. So current assets divided by current liability is 2.5. That means, can I say current asset is 2.5 times of current liability? Correct. Okay. Next, they give you net working capital. How much is net working capital given in the question? 480. Sir, how do you calculate net working capital? Current assets minus current liability is 480. Now, instead of current asset, I will substitute. What is current asset? 2.5. So, instead of current assets, I will write 2.5 times current liability minus current liability is 480. Now, with this, you will be able to solve current liability this way. That's the reason I said current ratio and net working capital are good connections. Okay, Saru? If you know current liability, automatically you know current asset. How much is current asset? 2.5 times of that, which is 8 lakh. Now you got total current assets and you got total current liability. Inner column or outer column? Outer column. Total current liability, how much? 320. Yes. Similarly, what is the total current assets? 8 lakh. Got it, everybody? Okay. Sir, if you just check the question, okay, have they given you any data? Sir, what are some of the examples of current liability? Can you tell me? Some of the common examples or components of current liability. Creditors, bills payable, outstanding expense, bank overdraft and all. In this problem, they have given bank overdraft. They have given bank overdraft. Bank overdraft is definitely current liability. Other than that, any reference to creditor, outstanding expense, blah, blah? No. So hence what we will do is, what is the total current liability just now we got? 320. In that 320, how much is bank overdraft? 80. Okay. And balance is others, 240. Arrived as a balancing figure. That's the reason I said always have an inner column. This way you will be able to figure out the things. They have given no data means then this is others arrived as a balancing figure. Basically 320 minus 80 will give you 2,40,000. What are others? Could be creditors, bills payable, outstanding expense. Don't know. Sir, can we prepare balance sheet on a balancing figure? Sir, in the ratio chapter, no, we are preparing balance sheet on a summarized basis. This is not actual balance sheet company will prepare. Sir, will company prepare balance sheet in this format or schedule 3 format? Schedule 3. So ratio is just that to the extent possible, you will prepare balance sheet. And other components, you can get it as a balancing figure. That is okay because this is a summarized balance sheet. Good so far? Same way current assets. What is the total current assets? 8 lakh. 8 lakh we have got it. But do we have any components of current assets or not yet? Not yet. So let this be on hold. Till now we have got this to be 8 lakh. Okay, move on. Next, sir, do you know current ratio? Yes. Do you know quick ratio? Do you know quick ratio? Yes. We just now said here it was given, no? Correct. Current ratio was given and also quick ratio is given. So I told, no, sir, these two are again a good connection. You will be able to use this information either to find a current asset or to find current liability or to find closing stock. Current asset, current liability I have to find or already found. That means in this problem, we'll use these two connections to find out closing stock. How? Let's see. Okay. Sir, how do you calculate quick ratio? Tell me the formula. Quick ratio, how do you calculate? Current assets minus closing stock divided by current liability. That quick ratio is given to be 1.5. So current assets minus closing stock divided by current liability is equal to 1.5. Current assets ka value you know. Current liability ka value you know. Only closing stock data is missing. So when you solve this equation, automatically you will get closing stock to be 3,20,000. That's all. Okay, sir. Because current assets you know, current liability also you know. Only component missing is closing stock. Should I have to solve it or fine? Fair enough, everybody. So closing stock value is how much? 3,20,000. Sir, what is the total current assets? 8 lakh. In this, we got one component of current asset, which is how much? Closing stock, 3,20,000. About debtors and all, have they given breakup or no breakup? Total current assets is 8 lakh. In that, if 320 is closing stock, means balance is other current assets arrived as a balancing figure, 4 lakh 80,000. That's all. This way, the current asset portion is fully done. Carry forward to the next one. Next, they gave proprietary funds. Correct? Now, something about proprietary funds they told. Oh, here. Fixed assets to proprietary fund is how much? 0.75. Let's use this information. They told fixed assets to proprietary funds. If you do fixed assets divided by proprietary funds, the question is saying it is 0.75. That means, can I say fixed asset is 0.5 times of proprietary fund? Okay, Ji. This I did not calculate. They gave in the question. Okay, fixed assets to proprietary ratio they gave. So, fixed assets divided by proprietary funds, if I do, you should get 0.75. Therefore, fixed asset constitutes 0.5 times of proprietary funds. Done? Okay. Now, let's try to calculate proprietary funds. There are two ways to calculate proprietary funds. Proprietary funds means owners' funds. Who are the owners? Shareholders. Who are the shareholders? Equity and preference shareholders. Keep that in mind and tell me how do you get proprietary funds? Proprietary funds is given by the formula. Equity share capital plus reserves and surplus plus preference share capital. That is one way. Okay, you can do equity share capital plus reserves and surplus plus preference share capital. Sir, in this problem, equity share capital, do you know? Missing. Reserves and surplus, do you know? Yes. Okay. Preference share capital, do you know? Yes. That also you don't know, right? That means data is missing. Let's use the other formula to calculate proprietary fund. What is one more formula to calculate proprietary fund? That is from the asset side, which is fixed asset plus net working capital minus debt. Minus long-term debt. Now, this is how you get proprietary fund. I'm calling proprietary fund as PF. Sir, instead of fixed asset, I will substitute. What is fixed asset? 0.75 of proprietary fund. So, proprietary fund is equal to 0.5 times of proprietary fund plus net working capital. Net working capital is missing in the question or given in the question. How much was net working capital as per the question? 4,80,000. Debt, no information. So, we'll take it as 0. So, using this, you will be able to calculate proprietary fund. When you substitute, you will get proprietary funds to be 19,20,000. That's how you calculate proprietary funds. Need a minute or okay? One way to calculate proprietary fund is this. Another way is this. Okay, G. If you want, I can prove this also. I proved it also in regular class. 2 minutes. If you want, I'll spend this also. Sir, this is the assumption. Just for your reference. This is the balance sheet data. Calculate proprietary funds for me. Normal way. How do you calculate proprietary funds? Equity share capital, reserves and surplus and preference share capital. Add these three, how much are you getting? 13 lakhs. So using normal way, if you calculate proprietary fund, it is 13 lakh. Another way to calculate proprietary fund is what? Fixed asset plus net working capital. How do you get working capital? Current assets minus current liability. These two you minus, how much is it? 3.5. So calculate using that route. Fixed asset is 12.5. Correct? Plus net working capital is 4 lakh minus 50,000, which is 3.5 lakh. Minus debt. How much is long-term debt? In long-term debt, I've assumed it to be 3 lakh. So minus 3 lakh you do. What are you getting? 13 lakh. Whether you use using normal route or the second formula, proprietary fund will be same. Okay. So based on the information given, either use this formula or this formula to calculate proprietary funds. Whenever they give you net working capital, probably you'll have to use this particular formula to calculate proprietary funds. That's how you can remember and calculate. Done, G. So now coming back to the question, how much is the proprietary fund? You got it now. 19,20,000. Sir, fixed asset is how much? Fixed asset is how much? 0.575 times of proprietary fund. If proprietary fund is 19,20,000 means fixed asset will be 0.575 times of that, which will be how much? 14,40,000. So you can go ahead and fill fixed asset in your balance sheet. Fixed asset is 14,20,000. Done, G. Fixed asset, you know. Total current assets, you know. That means you know the total asset side balance sheet, which is 22,40,000. Balance sheet always matches. Even if we don't match, we will match it somehow. Correct? If liability is 22.4 or asset is 22.4 means liability also should be 22.4. Correct, people? Now balancing figure. That's all. What is that? Sir, 22,40,000 is a total. In this, 3.2 is a current liability. Long-term debt, not there. Preference share capital, not there. No information. Reserves and surplus is given. Reserves and surplus is given. Sir, when you add all this compulsory, you should get 22,40,000. Take your calculator. 22.4 minus 320 minus 320 you do. 22 lakh 40,000 minus 320 minus 320. How much is that? 16 lakh. That is equity shares capital arrived as a balancing figure. You can arrive it as balancing figure or prepare a working note like this also. Your choice. Done, people? Huh? Yes. Or another way to calculate. If you don't like this approach, you can use another approach. Sir, how do you calculate proprietary funds? Or how do you calculate proprietary funds? Normal formula. Equity share capital, reserves and surplus, and preference share capital. Should you have to find proprietary fund or already worked? How much is that? 19 lakh 20,000. Equity share capital, we don't know. Reserves and surplus is given in the question to be 320. Preference share capital, no data, so it is taken as 0. Now, only thing missing in this problem is what? Equity share capital. Solve this equation, you will get equity share capital to be 16 lakh. Either you can prepare a working note or directly get equity share capital as a balancing figure. Your choice. This is how to figure out. Tell me, is this something I have to teach you or you can figure out all this? You can all do this on your own. It is just that, will you do it within that? Like if this question by chance comes for 7 marks, maximum in my view 15 minutes, not more than that. 20. Just looking at your face and saying, Papa, okay, 20. Beyond that, danger zone. Ideally 15. Okay. Maximum 20. Beyond that, I personally feel you are not in the right track of things. Okay. So that's things. All this will, again, as I said, it will come with the practice. Okay. So how to do it? Some common connections, whatever they use, I'll keep telling you so that you can use as a memory. But 1 or 2 new connections will be established. So ratio questions are meant, I say, gives ratio questions to waste your time. In ratio question, because since it is fill in the blanks wala question or finding the missing figure question, many students won't get it immediately. They will waste 5 to 10 minutes. So the ratio questions are meant like that. So always take up the ratio questions ideally. If you see any new adjustment, anyway, first 15 minutes, you will get to read the paper. So read the question. By chance, if you feel ratio questions is pretty straightforward, you're comfortable, means take it up. If you find any new adjustment, ideally, I would suggest take up all this question at the end. Finish all the questions. Always the first priority is solve those questions which you feel you are confident about first. New questions, you take it later based on the availability of time. So this way you will not waste time. Done. So this question is done from my end. Waiting or nexting or? Paka, 1 or 2 more I will take it up and then we will call it a quit for this particular question. Okay, next question. Ji. What is next question? Online also there, people still know? Is that a mosquito or a spider? Looks quite big. Mosquito means, oh, daivame. Okay, now all our attention will be there only. Correct now? Yeah. We are with you, sir. Sir, will you take investment decision today? Yes, much I will take that. You don't want me to take it, Sir, today's topic, what and all you will cover, you tell. No, I told you yesterday only, no, Ratio, investment decision, and dividend decisions. Those are the scope for today's session. Working capital tomorrow. RTP, MTP tomorrow. Now start. Following information relates to Temer Limited. I think this is a study material question or I don't know, previous year paper question. I don't remember. Study material question only. Awesome. Debtors velocity, Guru. You know debtors velocity. Sir, if you know debtors velocity, you can find out debtors turnover ratio. If you know debtors turnover ratio, you can find out debtors velocity. That way, how do you calculate debtors velocity? First tell me. Debtors velocity is given by 12. Sir, they have given the data in months. In a year, there are how many months? 12. So, debtors velocity is given by the formula 12 divided by DTR. So, using debtors velocity, here you can find out debtors turnover ratio. Okay, if required. Okay, we'll see. Similarly, they have also given creditors velocity. Using creditors velocity, you can calculate creditors turnover ratio. Basically, 12 divided by 2 you'll have to do. That way, you will get creditors turnover ratio to be 6. Then they have given stock turnover ratio. So, stock turnover ratio is a formula, or you can call it a stock turnover ratio or inventory turnover ratio. What's the formula? COGS divided by average stock or closing stock. If average is the first priority, if average is missing, then we'll go for closing stock. GP is 25%, and when they express, it is always 25% of sales. So, okay. So, GP is 25% of sales. Then bill receivable. They gave bill receivable. Sir, your debtor turnover ratio uses debtors or it uses accounts receivable? Accounts receivable. Accounts receivable means debtors and bill receivable put together. Keep that in mind. In this problem, BR and BP are there. So be careful when you calculate debtors turnover ratio and creditors turnover ratio here. This one. Then good thing they have given GP. They have given GP. And they have given fixed asset turnover ratio to be 4. Closing stock for the period is 10,000 above opening stock. So that means they have given some information about closing stock and opening stock. Sir, if they have given some information about opening and closing stock means average stock information missing or given? Given. So for inventory turnover ratio, we should take now closing stock or average stock? If they give you average stock directly, take average stock for calculating stock turnover ratio. Or if they give some information about average stock, you should always prefer average stock. If nothing is mentioned, if the sentence was not there, that means information is completely missing. In that case, you will take closing stock to calculate inventory turnover ratio or stock turnover ratio. How to start? Can you read this question and tell me how do you proceed? Don't look at your solution or study material or anywhere. Looking at this data, tell me how do you start? If suppose this question comes in your examination, you can find out sales. Perfect. How? Sir, GP is 25% of sales. GP you know. That means using these two connections, you can find out sales. Then, sir, if GP is 25% of sales means COGS will be 75% of sales because sales minus COGS only is your GP, no? Correct? So, if GP is 25% means, COGS is 75% of sales. The moment you know sales, you can find out COGS. The moment you know COGS, you can find out inventory turnover ratio. You can use and find out average stock. Then you can use this information to find out opening stock and closing stock. Correct? Now, fixed asset turnover ratio is given. Sales, means fixed asset also you can find out. Okay, sir? Right? The moment you know sales means using sales, you can also find out debtors. You can also find debtors. That's how the connection. If you are able to figure out this connection faster, then you will be able to solve the ratio question within the time. If you get stuck in figuring out things, then you will take 5 or 10 minutes extra. You will get it, but you will take 5 or 10 minutes extra. So watch out for the time. Alright, so let's calculate the things over here. So quickly tell sir, how much is GP? 4 lakh. What is GP percentage on sales? 25%. Let's take it up. Here. GP amount is given as 4 lakh and GP they told in the question is 25% of sales. So therefore sales is what, sir? GP divided by 25%. 4 lakh divided by 25% if you do, sales is how much? 16 lakh rupees. Got it? If GP is 25% of sales means COGS will be 75% of sales. 16 lakh ka 75% if you do, you'll get COGS. Okay. In fact, we didn't read the requirement of the question. What did they ask in the question? Watch out. Sometimes they ask weird things. They ask sales and COGS. Luckily, we already found that already. Great. Then they ask debtors, creditors, closing stock and these are not balance sheet question. You just need to find out these 5 or 6 missing components. Okay. Sales and COGS we already did. Okay. Next, sir. They are asking now the debtors. Can we calculate debtors? Okay. There are multiple ways here. I'll show you both according to me. There could be more also. The way I could think of, I say there are 2 ways I could finding the value of the debtors. You figure out what is comfortable for you. Okay. Sir, do you know sales? Do you know sales? Yes. Sir, if they don't give you the information, always take the total sales and credit sales is same. If they don't give you any cash sales information, the 16 lakh is what, sir? Total sales. The total sales and credit sale, we always assume it to be same. If cash sale is there in the question means they will clearly mention. If it is not mentioned, then all the sales are made on a credit basis is the assumption. Okay, sir? And debtors, you will get it on what sales? Credit sales. Yes? Okay, very simple. Sir, what is a sales? 16 lakh. This 16 lakh is 1 day ka sale or whole year ka? Whole year. And if you read the question, they gave you the data in days, weeks or months. Months. If you, I'll show it to you once again. They gave you the data in months. Check what did they tell? Come down. Here. Debtors velocity is how much? 3 months. Stop. Debtors velocity means what? Debtors velocity means debtors ka credit period. How much credit period are you giving to debtors? On an average, how much credit are you giving to your customers or debtors? 3 months. Okay. And okay, now come back to the question. How much is the sales? Just now we got sales to be how much? 16 lakh. 16 lakh is the sales for 12 months. Sir, are you giving 12 months credit to your debtors or only 3 months?
3 months.
How is this 3 months? They only told in the problem debtors velocity is 3 months. Debtors velocity means credit period. So for 12 months, the value is 16 lakh. Are you giving 12 months credit to your debtors or only 3 months? For 3 months, how much is the value? Find out this as a proration. Okay, this is one way. So when you calculate X, what it will be? Cross multiplication. 16 lakh into 3 divided by 12. If you do that, you will get 4 lakh. Mind you, this is not debtor. This is accounts receivable. This is accounts receivable. Because in this problem, they have given bill receivable. Okay, Saru. So total account receivable is how much? 4 lakh. Total accounts receivable is 4 lakh. Sir, in this, how do you get accounts receivable? Debtors plus bill receivable put together. Sir, accounts receivable is 4 lakh. Debtors you don't know, but bill receivable is given in the question to be 25,000. They gave. You can trust me on that. Yes, no? Yes. So bill receivable is 25 and total account receivable is 4 lakh. How do you calculate debtors here? These two come minus and debtors will give you 3,75,000. This is one way to calculate, one easy way to calculate debtors. Done, sir? If you don't like this approach, you can use formula. What is that? Sir, if they give you debtors turnover ratio, if they give you debtors velocity, using debtors velocity, can you calculate debtors turnover ratio? Yeah. How do you calculate debtors velocity? Tell me. Debtors velocity, how do you calculate? 12 divided by DTR. 12 divided by DTR. Data, that means therefore, if you have to find out DTR, what will you do? 12 divided by debtors velocity. Works both ways. So 12 is constant. Debtors velocity is given in the question to be 3. That means debtors turnover ratio is how much? Using debtors velocity, you got debtors turnover ratio to be 4. Okay. So far good, everybody? Sir, what is the formula to calculate debtors turnover ratio? Tell me. Debtors turnover ratio. Any turnover ratio, the formula is sales in the denominator. Which sales? Total sales or credit sales? Here anyway, total sales and is assumed to be credit sales. That means the formula is annual credit sales divided by, not debtors, divided by average accounts receivable. Have they given you account receivable ka opening and closing balance? No. That means you will take closing balance of accounts receivable. This is the formula. Debtors turnover ratio, you already got it to be 4. Annual credit sales, you already got it to be 16 lakh. Therefore, accounts receivable is how much? 4 lakh. That you got how much in the previous method? 4 lakh. You can choose whatever method. Okay. Now, accounts receivable, how do you calculate? Accounts receivable is nothing but debtors and bill receivable put together. Okay. In this 4 lakh, if bill receivable is 25,000, means debtor will be 3,75,000. Manageable. One you present, I've just shown both for your reference, whichever works for you. If you are a believer in formula, you can go for this method. Or if you feel this is workable, we can use this method also. I prefer this because you don't have to remember any formulas. You can directly get it. Dana sir, debtors, we got it. Okay, G. Alright, next they asked, I think, third step, what did they ask? I think here somewhere I've written. Where it, third one. Creditors they asked. Okay, creditors, let's calculate. Fine. Sir, okay, what is creditors turnover ratio? They have given you creditors velocity, right? Is it okay if I stick to this method? That's okay with your proration. You can also use formula method that you can choose. I think I'm here for the creditors. I've only done this method, I think, in the interest of time. Okay. Sir, tell me, creditors what is the formula for creditors turnover ratio? Annual credit purchases. Stress on that word. Annual credit purchases divided by average accounts payable. If not, if average is missing, then you will take closing balance of accounts payable. Correct? Okay. For creditors, we need annual credit purchases. Is that given or missing? Missing. Okay. Sir, there is a way to calculate credit purchase through COGS. Tell me, what is the formula to calculate COGS? How do you calculate COGS? Cost of goods sold?
Sales minus.
No, one is okay. Sales minus GP. Leave that. Normal way, tell me. COGS. Cost of goods sold. Opening stock plus purchases minus closing stock. Sir, if you know opening stock, if you know closing stock, if you know COGS, can you find out purchases? Yes. Means to calculate creditor, first we need to know opening stock and closing stock. Okay. Opening stock and closing stock, which information considers? Stock turnover ratio. So first we will solve stock turnover ratio. Okay, G. So we'll take this way. Sir, inventory turnover ratio or stock turnover ratio is given in the formula in the question to be 1.5. This is given, right? What is the formula to calculate inventory turnover ratio? COGS divided by average stock. So should we take average stock here or closing stock? In this problem, they mentioned in the question that closing stock is 10,000 more than opening stock. So if closing stock and opening stock data is mentioned, means obviously we need to take average stock. COGS, do you know? Yes, COGS we already found to be 12 lakh. So 12 lakh is your numerator. Average stock we don't know is equal to 1.5. So solve this. Average stock you'll get it to be 8 lakh. Done, sir. Sir, how do you calculate average stock? What is the way to calculate simple average? Or average stock is given by the formula opening stock plus closing stock divided by 2. Average stock just now we got it to be 8 lakh. Opening stock, let it be as it is. They told in the problem, they mentioned that clearly that closing stock is 10,000 more than opening stock. I'm not saying, question me they told, we read this, yes. Closing stock is 10,000 more than opening stock. So if opening stock is 50,000 means closing stock will be 10,000 more, which is 60,000. Let opening stock be OS. You can assume some variable also, X or A. I'm just taking it as OS. If opening stock is OS means closing stock will be OS plus 10,000, correct? Correct. So that's what I'm substituting. So instead of closing stock, you write opening stock plus 10,000. Now solve this equation. When you solve, you'll get opening stock to be 7,95,000. Correct? No? I hope I don't have to waste my time in solving now. That is okay. So opening stock is 795 means closing stock will be how much? 10,000 more, which will be how much? 8,05,000. Okay, G. Cool. Now you know opening stock also. You know closing stock also. You know COGS also. That means can we find purchases? Yeah, that means now we can go for creditors. For creditors finding out, we need annual credit purchase. Through that credit purchase, we'll get it with the help of COGS equation. COGS is given by opening stock plus purchases minus closing stock. COGS we already got it to be 12 lakh. Opening stock just now we got it 795. Closing stock just now we got it 805. Purchases is missing. So use this equation to find missing purchases of how much? 12 lakh 10,000. Easy, people. Doubt or okay? This 12 lakh 10,000 is one day purchases or whole year ka? This 12 lakh 10,000 is purchases for the whole year. Sir, they have given you creditors velocity in the question. Check how much is creditors velocity. Creditors velocity means how much credit period are we getting from creditors. If you buy the goods from creditor today, will you pay today or after 2 months? After 2 months, because creditors velocity or creditors ka payment period is 2 months. Okay. Come back to the question. How much is the purchases? 12 lakh 10,000. 12 lakh 10,000 is the value for 12 months. Are you getting 12 months credit from your creditors or only 2 months? For 2 months, how much is the value? Find out that. When you prorate, X is equal to what? 12 lakh 10,000 into 2 divided by 12. If you do that, you will get it to be how much? 2 lakh 1,667. Sir, is this creditor or accounts payable? This is accounts payable. Okay, G. If you don't want this one, you can go another way. What is another way? Using creditors velocity, you can find out creditors ka turnover ratio. And then apply creditors ka turnover ratio ka formula. Creditors turnover ratio is given by the formula. Annual credit purchases are divided by accounts payable. That way you will get accounts payable. Okay, or you can directly get it like this. How much is accounts payable? 201,667. What put together we call it as accounts payable? Creditors plus bills payable. If you add up, you will get accounts payable. Accounts payable, we have got it. Bills payable is given in the question to be 10,000. That means your creditors will be missing. So, which is how much? 201 minus 10,000. If you do, you'll get 191,667. This way. Done, sir? Alright. Next, they asked you to find out fixed asset. And they give you fixed asset turnover ratio they have given in the question. How much? 4. Sir, what is the formula? This is given. Fixed asset turnover ratio is 4 is mentioned in the question. What is the formula to calculate fixed asset turnover ratio? Sales divided by fixed asset is equal to how much? 4. Sales you already know. How much is that? 16 lakh. Fixed assets you don't know. This should be equal to 4. When you solve this equation, you will get fixed asset to be 4 lakh. This is how they establish the connection. That's what I think all the requirements we have solved. Need some time to review or next question? Maybe one more I will take it up. I think I have another 5 minutes. So I'll maybe take up this one more question I will take up. This is a May 24 wala question. One or two more good questions are there in RTP also. That also I will do it. Okay. Check, sir. Team Limited provides you the following information. 12.5% debt. So when you read the data, you should be very careful ratio. There will be many hidden information. 12.5% debt is how much? 45 lakh. The moment you read 12.5%, one thing should click in your mind. What is that? Interest. So they will not give you any interest. See, they will give you this data and they will say in the question, calculate interest coverage ratio. And calculate, to calculate interest coverage ratio is given by the formula EBIT divided by interest. Is interest given anywhere here? Specifically? No. And they don't have to give. If the debt value is 45 lakh and if it is 12.5% debt, what is the interest? 45 lakh ka 12.5%, which is 5 lakh ka 60 to 5 like that. So that's the reason each data, especially percentage and all, you should read it very carefully. So you got your interest through this. Okay, next. Now check. Debt value is how much? 45 lakh. Then they have given debt to equity ratio is 1.5:1, or you can simply call that as 1.5. Because 1.5 divided by 1, if you do, automatically you will get what? 1.5. So debt equity ratio is 1.5. Tell me the formula for debt equity ratio. Debt to divided by equity is equal to 1.5. Debt is already known, 45 lakh. That means using this information you can find out equity. That is one. Okay, Saru. All right. Then they have given return on shareholders fund. Shareholders funds means return on equity. What's the formula to calculate return on equity? Each divided by equity. Equity already got it. And return on equity is given to be 54%. That means you can use this information to find out each. That's the way connection. Okay. Next, they have given operating ratio is 85%. If operating ratio is 85%, means indirectly they're telling COGS plus operating expense put together is 85% of sales. Therefore, your EBIT will be what? 15%. If this is 85%, means the balance 15% will be your EBIT. Got it? So if you know EBIT, you can find out sales. Or if you know sales, you can find out EBIT. So we will use this equation to find one of the missing components. Then they have given operating expense. Operating expense means administrative overheads and selling and distribution overheads. That is to COGS. COGS is 2.6. So we can use this equation to find out maybe COGS and operating expense. Tax rate is 25%. Fixed asset is given to be 39 lakh. Current ratio is 1.8:1. That's as good as saying current ratio is 1.8. You are required to calculate interest dividend coverage ratio. For that, we need EBIT and interest. Interest we already calculated. All the things we need to find out is EBIT. Then they asked GP ratio. For that, we need GP and sales. And then they asked you current assets. So this is the requirement of the question. At least we figure out few things. Let's put up that. Now, debt to equity ratio they have given. So we'll start with this. Using this ratio, what we can find? Equity. So debt equity ratio is how much? 1.5. So how do you get debt equity ratio? Debt divided by equity is given to be 1.5:1. So basically debt is 45 lakh. Equity is not given. This ratio is given to be 1.5. So solving this equation, you will get equity to be how much? 30 lakh. Cool. Okay. Next thing you can find out each. Because in the problem they gave return on shareholders funds, as in return on equity was given in the question to be how much? 54%. Yes, sir. This I am not doing. This they have given in the question. How do you calculate return on equity? What's the formula? Each divided by equity is equal to 0.54. Equity just now we found out. How much is that? 30 lakhs. So this you already know. Sir, in this problem we read, have they given any preference shares? We read the question. Is there any preference shares? If preference shares is not there, means PAT and each are same. Okay. You can call it as each or you can call it as PAT. It is one and the same in this problem because there is no preference shares. Hence, I have called it as PAT. Okay, sir. So PAT divided by 30 lakh is equal to 0.54. Therefore, profit after tax is how much? 16 lakh 20,000. Sir, whenever they give you this question, if you are stuck, right? It's again better to prepare an income statement. It's better to prepare a income statement because they asked you GP. They asked you GP. To calculate GP we need, or to calculate GP percentage we need GP and sales. Correct? And they have asked you interest coverage ratio and all. So hence, few things you may not be able to figure it out if you solve it as a working note. But the moment you put income statement, you will be able to get few components directly by looking at income statement. So let's do a thing. Whatever data we got it, we will put it up. How much is the PAT we have got it? 16 lakh 20,000. So let's put that in. Earnings after tax is 16 lakh 20,000. With this, we have got it so far. Correct, sir? All right. Now let's see if we can work backwards. Sir, this is earnings after tax. They gave the tax rate in the question. How much was the tax rate given in the question? 25%. Okay. Now I'll ask you a simple thing. Sir, if earnings before tax is 100 means how much will be tax? If assume if earnings before tax is 100 means tax will be 25. That means after tax will be. That means can I say earnings after tax is 75% and earnings before tax is how much? 100%. So it's like this calculating. 16 lakh 20,000 represents 75%. We want earnings before tax, which represents how much percentage? 100%. For 100%, how much is the value? Can you find out that value for me? When you calculate it, automatically you'll get how much, sir? 21 lakh 60,000. That's how we can calculate this particular number. Easy. Everyone, cool. Once more or okay? Everyone, any problem? Once more. Okay. If earnings before tax, if it is 100, if this number is 100, how much will be the tax amount? 25. That means profit after tax will be 75. That means earnings after tax represents what percentage? 75%. EBT represents how much percentage? 100%. Do you know earnings after tax ka value? Yes. How much is that? 16 lakh 20,000. This is on which platform? 16 lakh 20,000 represents 75%. We want earnings before tax. EBT is on what platform? 100%. For 75%, if it is 1620 means for 100%, how much is the value? Prorate. So x is equal to what? 1620 into 100 divided by 75. That way, if you do, you'll get, that's what I've done here. You'll get 21 lakh 60,000. See, if you calculate, if you don't put this income statement, can you figure out EBT? No. When you put income statement, automatically you'll get to know, you can calculate this. So that will give you some help, some guidance. So this is done and this is done. Automatically you can do tax also. If this is 21 lakh 60,000 means tax will be 5 lakh 40,000. Basically 21 lakh 60,000 ka 25%. Correct, people? Okay, ji. Now, sir, do you know interest? I'm working it backwards. Format and all I don't have to discuss. No? You know the format, right? Sales minus GP is COGS. From COGS, if you reduce operating expense, you will get EBIT. From EBIT, reduce interest, EBT. Like that. This format, have it in place and go on figuring it out. Interest is missing or found out? Found out. How? Sir, debt value they gave in the question to be 45 lakh and this debt carries an interest rate of 12.5%. That means the debt is how much? 560 to 500. Sir, if earnings before tax is 2160 and if interest is 562 means what will be your EBIT? These two are addition, correct or no? So EBT is 21 lakh 60,000 plus 5 lakh 60 to 500, which is how much? 27 lakh 20 to 500. That way, this also you can figure it out. Done, sir. This is what I wanted. This is what I wanted. Why? Because they told in the question operating ratio is 85%. If operating ratio is 85% means EBIT will be 15% of sales. Now EBIT we got it. EBIT just now we got it. If you know EBIT means can you find out sales? Yes. Therefore sales will be what, sir? Therefore sales will be EBIT divided by 15%. Correct? EBIT how much we got it just now? EBIT just now we got it to be 27 lakh 22,500. Take your calculator. 27 lakh 22,500 divided by 15% you do. Divided by 0.15. That is what I've done as working out here. 27 22 500 divided by 0.15 if you do, you will get 1 crore 81 lakh 50,000. There comes your sales. So this we got. Yes, people. Comfortable? Yes. Sir, we need COGS and we need now operating expense. If you do it, more or less income statement is complete. Now they have given a connection. What is that? They've given one connection. What is that? Check the question they told. What is that connection they told? Operating expense to COGS is 2:6. Operating expense is to COGS is 2:6. So tell me this in numerator denominator way. Operating expense divided by COGS is equal to 2 divided by 6. Correct? Solve this. 6 will go to the other side. 2 will go to the other side. So 6 times of operating expense is equal to 2 times of COGS. If you want, you can simplify. Right? So therefore COGS will be what, sir? 2 you will divide. So therefore COGS is equal to 3 times of operating expense. Any problem? So COGS is equal to 3 times of operating expense. This data they gave, figuring out that we have brought this equation. Yes, people? Now go back. They told in the problem operating ratio is what? They told in the problem operating ratio is 85%. Once again, if you want, I'll show it to you. Operating ratio is 85%. Sir, how do you get operating ratio? Tell me once again. In fact, we wrote it also. Operating ratio means COGS plus operating expense is 85% of sales. Substitute now. COGS, that's what I've taken here. COGS plus operating expense is 85% of sales. Instead of COGS, what will I write? Instead of COGS, I'll substitute. I'll substitute it as 3 times of operating expense plus operating expense is equal to 85% of sales. Sales value we already know. Using this, you'll be able to find out operating expense to be 38,56,875. Substitution. Okay, Saru? Sir, if you know operating expense, automatically you know COGS because COGS is 3 times of operating expense. So COGS also you got it. So COGS you know, operating expense also you know, plug that number. Accordingly, whole income statement will get solved. Good question according to me. Fine, people. Now the requirement. What is the requirement they asked? Interest coverage ratio. Interest coverage ratio is given by the formula EBIT divided by interest. Quickly do. 2722 500 divided by 562 500. If you do that, you should be getting 4.8. That is interest dividend coverage ratio. First requirement. Correct. Next, they ask GP ratio. GP ratio is given by the formula GP upon sales into 100. Okay, so GP you already know. Sales you know, COGS you know means sales minus COGS is nothing but your GP. I think you can figure out this. This is also done. Correct. Anything else they asked? Yes, they asked one more component called current asset. Killer, I tell you. Why? Sir, absolutely no data. They have given only what? Fixed assets. No, and they have given one more current ratio. They have given. How do you get current ratio? Current assets divided by current liability is 1.8. Therefore, current asset is 1.8 times of current liability. Current liability missing. Current asset we have to find out missing. Fixed asset data not given. That means what to do? How to proceed? You have to use your kidney. What is that? Sir, tell me, visualize your balance sheet. On the balance sheet, asset side, what and all will come? Fixed asset, current assets. Fixed asset and current assets. You know, total liability side and total asset side will match. Instead of total assets, what we can write? Instead of total assets, we can write a fixed asset plus current asset. That should be equal to total liability. Visualize. On the liability side, what and all will come? Equity, share capital and reserves and surplus. Equity, share capital and reserves and surplus put together only we call it as equity. Because in this problem, we don't have breakup. We have equity. Hence, instead of equity, share capital and reserves and surplus, I will write equity plus preference share capital plus debt plus current liability. Correct? No? You know that balance sheet ka total asset side and total liability side will match. You have to use this equation. Fixed asset they have given in the question to be 39 lakh. Current assets we don't know, but we will substitute. Using current ratio, we got it that current asset is 1.8 times of current liability. Instead of current assets, we will write 1.8 times current liability. Got it? Debt equity we found out as working out number 1. How much? 30 lakh. Debt was given in the question to be 45 lakh. Preference share capital not given, so we will take it as 0. Current liability not given, we will write it as CL only. So if you just check in this number, only CL is missing. Correct? Yes. So solve this equation to get current liability to be 45 lakh. If current liability is 45 lakh means current asset is 1.8 times of that, which is 81 lakh. Good. Okay. Good. I think the person who created the Sudoku used their kidney properly. So balance sheet equation they have used. Total assets is equal to total liability. You have to use that equation and figure out current assets in this particular question. Done, Saru? Yeah. All right. Now this is okay. I think just one more I will quickly tell. Problem is done. Just some pointers according to me. This one. Sir, just some pointers are given in regular class which can help you guide you a little better. So with this we already discussed. Always write current assets and current liability in the inner column of balance sheet. That way you will be able to figure out some components as balancing figure. This you know. Accounts receivable is always debtor plus bill receivable put together. And debtor's turnover ratio uses accounts receivable, not debtor. Okay, debtor turnover ratio uses what in the denominator? Debtor turnover ratio is given by the formula credit sales divided by average accounts receivable or closing balance of accounts receivable. Especially pay attention in the problem where they give you bill receivable and bills payable. Proprietary fund, two ways to calculate. One way is equity share capital plus reserves and surplus plus preference share capital. Another way, fixed asset plus net working capital minus debt, which we applied in one question also. Correct? Okay. One more adjustment is, sir, in some problem, sir, they will not give you profit. They will not give you profit. They will give you balance sheet. They will give you balance sheet for current year and previous year they will give you. Last year ka closing balance becomes current year ka opening balance. In that balance sheet, you will have retained earnings. So retained earnings ka opening balance will be given to you 15, closing balance will be given to you 20 lakh. This data will be available in balance sheet. Now what happened? Opening balance of retained earnings is 15 and closing has become 20. That means what? Current year mein company has earned a profit of 5 lakh because 15 has become 20. No, that means after doing all the adjustments, current year ka profit is 5 lakh. This is a hidden adjustment to find out profit for the current year. There's another way they've asked. Okay, and this we already know. Total assets. Total asset is nothing but fixed asset plus current asset will always be equal to total liability. Total liability you can substitute as equity plus debt plus preference share capital plus current liability. Just now we did that. And this also you know. If operating ratio is 85% means indirectly they're telling EBIT is 15% of sale. Operating ratio is 85% means another way to tell it is COGS plus operating expense put together is equal to 85% of sales. That way also you can call it. Correct, sir? Alright. And then always watch out in the problem when net working capital and current ratio is given in the problem. You can substitute and get current assets and current liability. And also watch out when current ratio and quick ratio is given. You can substitute and find out, usually you can find out the closing stock or current assets, current liability using this sort of equation. Okay. These are some pointers I had given in my regular class. Fine. With this, the revision part of the ratio is complete. Thank you. Hello, people. So let's continue our revision series. So next we'll be discussing investment decision wala topic, a big ticket topic. So we have taken a substantial amount of time to cover this topic in our regular class. We'll try our best to cover as much as possible in our revision series. Now, what is this investment decision is? Sir, let's say I want to buy a machinery worth 100 crore or I want to do a business expansion plan. All these are small decisions or these are big decisions. These are big decisions which will involve big amounts and they'll have an impact for a short period of time or long period of time. Long period of time. So randomly can you decide to do it or carefully planning is required? You have to do a careful analysis, right? Whether to buy an asset or whether to expand or whether to replace an asset, all this you need to carefully decide, right? For that you need certain methods. You need certain methods. Those methods only is referred to as a capital budgeting. So capital budgeting is basically certain techniques which helps you to decide these sort of decisions. Okay, like just to give you a small another example, let's say plant and machinery. A company wants to buy a plant and machinery. They have two options. One, they can buy locally for 8 crore. Within India only they can purchase by paying this machinery how much? 8 crore. Which will this machinery ka useful life being 8 years. And if you buy the machinery locally, you can use it for 10 hours every day. But by chance, you have another option as well where you can import this machinery for 9 crore from Japan, where life will be same. But if you buy an imported machinery, it can work for 12 hours every day. Which one will you go for? You have one option or multiple option. And amount is also small or quite big? Quite big. So that means you need certain methods or techniques to help you make this decision. That techniques or those methods only is referred to as capital budgeting. That's all. Okay. Capital budgeting is simply some techniques which will help you to make these sort of complex decision because these involves a big amount of time and has an impact for a long period of time. That's all. Okay. That is one. Sir, majority. How was Kowai Saru? Kowai is good, but I have not been anywhere much. I'll have maybe on the last day I will see. For the time being, anyway, marathon class only is going on for a long period of time. No, I'm a little tired after class, so I just go. I'm in a little rest. I just go for a small walk. Anyways, today, if time permits, maybe I'll go. You can suggest. But for now, coming back to the topic. So, for all this capital budgeting techniques, we need cash flows. these capital budgeting techniques take the help of cash flows for decision making. And in majority of our problem, cash flows, no sir, will not be given. We have to find out. They will give you sales. They will give you sales and certain expense data. From sales, we have to get cash flow, or we have to estimate the cash flow. So first what we have to do is we have to arrive profit after tax. First we have to get profit after tax. That is your normal process. Meaning they will give you sales. Okay. From that, reduce all your expenses. Doesn't matter. You can give a specific name like fixed cost or variable cost or whatever expense. From sale, reduce all the expenses. You will get earnings before tax. From that, you reduce tax. You will get earnings after tax. This only we call it as net profit. So till here, same calculation. The way we have been doing it, you have to do it. You don't have to give any name for all those expenses. Just go on deducting them and arrive profit after tax. Once you get profit after tax, capital budgeting uses net profit or profit after tax for decision making or cash flow. Cash flow. From net profit, we have to derive cash flows. For that, from here to here, there are, I say, 5 adjustments to be done. Actually 6. One mostly will not come in majority of the question. So I would probably stick to the 5 adjustments. First, get profit after tax. After that, you'll have to do 5 adjustments. Quickly, I'll review that adjustment now. Then we'll apply it in one of the questions later on. First adjustment is depreciation. Add back depreciation. Because, sir, you will pay tax to the government after deducting all the expenses. Depreciation is also an expense. First, reduce that. Then only you will get profit before tax. On this, you will calculate tax and get profit after tax. But we want profit or we want cash flow? Cash flow. Due to depreciation. Depreciation is no doubt an expense. But due to depreciation expense, did cash go out or it did not go out? Not go out. You already reduced it here. So hence you add back here. Because due to depreciation, cash did not go out. Sir, why did we reduce it here in the first place? To calculate the correct tax amount. You'll get the tax amount only after reducing all the expense. Expense also includes depreciation. Because on depreciation, you'll always get some tax benefit. That is the reason. For tax benefit purpose, initially we reduce. Because cash did not go out, you add back later. That's the first adjustment. Okay, Saru? Then the second adjustment is if you have any salvage value. If you have any salvage value, add it. Salvage value means scrap value or residual value. You will get salvage value every year or once. Once. That too when you sell the asset at the end of asset ka useful life. And in this particular example, useful life of the asset is how much? 8 years. I mean salvage value you will receive every year or 8th year. So when you are finding 8th year ka cash flow, you need to add a salvage. That's what I've written. Salvage value at the end of the project you need to add. This is second adjustment. Third adjustment is if there is any opportunity cost. If there is any opportunity cost, you need to consider that. Opportunity cost could be an inflow fine or it could be an outflow. If it is from the inflow angle, you will add. Otherwise, you will minus. I'll take up this in one of the questions. For now, it's okay. We're quickly revising the format. That's all. Okay, this is one. Then, if there is any working capital, you need to consider. Sir, to start the project, we need only fixed asset or you need money for running your day-to-day business also. So now, if you have to run this Coimbatore branch, we need laptop also. We need people also. To people, we have to pay salary. That means we need money for running day-to-day business also. We need money for buying fixed asset also. So working capital also initially you need to invest. So hence at year 0, working capital is treated as an outflow. So in this format, if there is an inflow means we show it as positive number. If there is cash outflow, we show it as negative number. Initially, company has to invest working capital. That means this should be a positive or negative? Negative number. At the end of the project, we'll recover everything if you're doing a project. So by the end of the project, we'll show working capital as a positive number. That is one. I'll discuss all this again. For now, quick discussion. That's it. Next is if you have any additional working capital or additional investment, if it is specified in the question, you need to consider. These are 5 adjustments. If you do from profit after tax, you will get future annual cash flows. Okay. Now, sir, if you use an asset here, sir, what is the useful life of the asset? 8 years. I mean, this asset will give you the benefit for a period of 8 years. Sir, are you taking the decision after 8 years or today? You are deciding today whether to go for option 1 or option 2. That means can you decide based on future value of cash flows or present value? Present value. All this cash flows is represented on what platform? Future value cash flow. How do you get present value of that? Multiply discount factor. From future value, if you multiply discount factor, automatically you will get present value of cash flows. This is the thing. Based on this, we'll have to take some decisions. We will see what those are. But this is the basic format of finding your cash flows. There are multiple ways to calculate this, multiple formats also, but all in our regular class, we have used this format. So I'll stick to this. Okay. Can I move forward to the next one? We will apply this in one of the questions. Again, I'll come back to it and little more detailed we will discuss the components. Okay. But the takeaway of this discussion was, for investment decision, we don't need profit, we need cash flows. And that too, cash flows should be represented on future value platform or present value. Present value. That's the simple discussion ka conclusion. Okay, sir. All right. Let's dive a little further now. So all this decision is done with the help of a technique. What is the technique name? Capital budgeting. So let's look at capital budgeting ka techniques or methods one by one. First sort of capital budgeting technique is payback period. Okay. So we have actually broadly capital budgeting techniques are of two types. Discounting techniques, non-discounting techniques. Non-discounting technique means they don't worry about the discount factor. You don't have to worry about the discount factor because these concepts ignore time value of money. Okay. So some of the examples of non-discounting techniques are payback period, payback reciprocal, accounting rate of return. These three are those techniques which does not worry about time value of money, meaning you don't need any discount factor and present value and all for them. Okay. All right. First, let's take it up, which is payback period. Name itself is saying payback period. Payback period is a technique which is trying to calculate in how many months or in how many years will you recover your initial investment. To do a particular project or to buy a certain assets, we need to invest money. In how many months or in how many years will you recover that initial investment only is what payback period is trying to calculate. Okay, sir? All right. Sir, how to calculate payback period? Sir, for that first you need to check. In the previously I showed you annual cash flows, remember here? Here we calculated annual cash flows, right? Okay, this one. How do you get annual cash flows again? First find out profit after tax. After that 5 adjustments. Depreciation, salvage value, working capital, opportunity cost, additional working capital or additional investment if required. So you need to adjust them. You will get automatically future annual cash flows. Now for payback period, first you need to check whether this annual cash flow is constant or not constant. Constant means whether it is same every year. Is this annual net cash flow same every year or not? If annual net cash flow, if you are getting same benefit every year, if you are getting same cash flow every year, then payback period is given by the formula initial investment divided by annual cash flow. It's like here, check. Let's say to do a particular project, initially we invested 12 lakh. To do a particular project, initially we invested 12 lakh. From this project, we will get a benefit of 3 lakh rupees. We will get a cash flow of 3 lakh rupees every year. Changing or same? Same. Every year, how much net cash flow you will get? 3 lakh. Tell me, sorry, how many years can you recover 12 lakh? You invested 12 lakh today. Every year, if you get 3 lakh means you can recover your investment within 4 years. How did you calculate that? 12 lakh divided by 3 lakh. Express that in formula. What is that 12 lakh? Initial investment. What is that 3 lakh? Annual net cash flow. That's what I've written here. So if annual net cash flow is constant, payback period is simply given by the formula initial investment divided by annual net cash flows. Okay. Is it mandatory every year ka net cash flow should be same or it can change also? Meaning if annual net cash flow, if it is not constant, if it is not same every year, in that case, what to do? In that case, you'll have to go for something called cumulative approach. How does it work? Let's look at this. Let's say a particular asset. I have purchased a particular asset by investing 12 lakh rupees. Same. Initially, what is my investment? I purchased a fixed asset by investing 12 lakh. From that fixed asset, I'm expecting benefit to last for 5 years. First year, I will get 1 year benefit in the form of cash flow. Second year, 2 lakh, then 4, then 5 and 6. Is the cash flow or net cash flow every year same or different? So in this case, we'll have to do something called a cumulative approach. Accumulate something means what? Adding. So you have to find, here you have cumulative cash flow. No? Find out something known as cumulative cash flows. Cumulative cash flow means adding up. First year, how much is your cash flow? 1 lakh. Second year, no sir, 1 lakh you already got, another 2 lakh you got more. How much is it totally? 3 lakh. Next year, again, another 4 lakh you got. So 3 lakh plus 4 lakh you do. How much is that? 7 lakh. Then another 5 lakh you got. How much you got? 12. 12 plus 16, how much? 8 lakh. This is how you find out cumulative cash flows. Okay, sir. So payback period means what? in how many months or in how many years you will recover your initial investment. What is the initial investment in this example? 12 lakh. Check 12 lakh is there in any column here. Yes, 12 lakh is there in this column, and this pertains to which year? Fourth year. That means you are able to recover your initial investment of 12 lakh within 4 years. So therefore, payback period is how much? 4 years. This is your cumulative approach. Got it, people? Okay. Comfortable? Suppose if the initial investment is 14 lakh. If it is 14 lakh. Now check, is any number in cumulative cash flow having 14 lakh? No. If it is, in the previous case, it was 12 lakh and you found it quickly like that. Suppose initial investment, if it is 14 lakh, in that case, what to do? Check. Sir, up to 4th year, how much have you recovered? 12 lakh. Up to 5th year, totally, how much you are recovering? 18 lakh. How much is your initial investment? 14 lakh is somewhere between year 4 to year 5. Do you agree with my statement? Payback period is somewhere between year 4 to year 5, because 14 lakh recovery is happening somewhere between these two, correct? So how to find out that? Take a lower year. Which is a lower year? 4th. Okay, if you want, you can take it as a formula. I'd explain you one more logical method also. Now probably we'll stick to formula, that is easier. So take 4 plus, why 4? Because the 4th is that lower number, plus required cash flow divided by actual cash flow. 4 plus required cash flow divided by actual cash flow. Why every time it is 4, or in this problem it is 4? In this problem, why? Payback period is lying somewhere between 4 and 5. So start with the lower number, which is 4 plus 4 plus required cash flow. So till 4th year, how much have you recovered? 12 lakh. How much you need for your recovery? 12 lakh you have recovered, but totally you want to recover 14 lakh. So how much additionally you want to recover? 2 lakh. That's what we mean by required cash flow. You need to recover how much more? 12 lakh you have already recovered. You need to recover additional 2 lakh more. So required cash flow is 2 lakh. But in the actual 5th year, how much did you recover? What is the actual cash flow you recovered? 6 lakh. That is your actual cash flows. If you do that, automatically you will get payback period 4.33, whatever. You can express it in months or years or whatever you're comfortable with. This is how you find out the payback period when net cash flow, when it is not constant. Easy, sir. Okay. All right. Can I move on to the next one? Okay. Next one is payback reciprocal. Reciprocal or something means ulta, reverse. So this is payback ka reciprocal. That means payback reciprocal is given by the formula 1 upon payback period. 1 divided by payback period. If you do, automatically you will get payback reciprocal. Okay, suppose a payback period was 5 years. Suppose payback period was 5 years. You have to do 1 divided by 5. If you do 1 divided by 5, how much are you going to get? 0.2. If you want to express that in percentage, how much it will be? 20%. Yes. So this is how you calculate payback reciprocal. Now, why do we calculate payback reciprocal is, some people have done their studies, and as per their studies, payback reciprocal will approximate to IRR. Payback reciprocal will be almost equal to IRR if life of the project is twice of the payback period. If the project ka total life, if it is twice of the payback period, then this payback reciprocal and IRR will be mostly same. Like here, let's say payback period you calculated and you got it to be 3 years. Payback period you calculated and I'm assuming it to be 3 years. Let's say the total useful life of the project is 6 years. Total useful life of the project is 6 years. Sir, you have to do twice of the payback period. Payback period into 2 you do. What is payback period here? I've assumed 3. 3 into 2 you do. How much is it? 6. Is the project ka life 6 or more? Is the project ka life 6 or more? Yes. If the project ka life here is 6 or more means, then this payback reciprocal and IRR will be mostly same. You know, you have certain way to calculate IRR. Payback reciprocal is like a shortcut way to calculate IRR. Payback reciprocal is a shortcut way to calculate IRR. That means I will use this in my exam, sir. Please don't. Okay, when they ask IRR, do it normal way. If they ask payback reciprocal, do it this way. Understood? So this is what they're trying to say. If the life of the project, if it is at least twice of the payback period, then the payback reciprocal and IRR will be all more or less same. That's all this is trying to calculate. Not that important, yeah. But for MCQ questions and all, if at all they want to ask, they can ask it. Can I move forward? Any doubt? Okay, Ji. All right. 2 techniques we have done: payback period and payback reciprocal. Payback reciprocal is not really a technique; it is more like an extension. Another non-discounting technique we have is accounting rate of return, ARR, also known as average rate of return or also known as book rate of return. Multiple names, same, one and the same. ARR is what we will stick to it for class purpose. Sir, majority of, in fact, all of capital budgeting techniques use cash flows. All capital budgeting techniques use cash flows. ARR is one such techniques which uses PAT, which uses earnings after tax or profit after tax. For ARR, we don't need cash flow because this is what, sir? ARR is accounting rate of return. In accounts, will you show cash flow or you work with profit? Profit. So for accounting rate of return, you always, this technique uses profit and cash, not cash flow. All other techniques uses cash flows. Accounting rate of return uses profit as a base to do the analysis. Yes, people. So ARR is given by the formula average PAT divided by average investment or initial investment. To find out ARR, to find a return, sir. How do you get return? GP is a return. How do you get return? GP percentage, how do you find out? GP divided by sales into 100. GP is a return. That return percentage is given with the formula return amount divided by sales amount into 100. Here also same thing. ARR is a return. Hence we'll take what? PAT in the numerator divided by investment, because to get the return we have to make some investment. So hence ARR is given by the formula average PAT divided by, either you can take initial investment or you can take average investment. My preference is average investment, but I say books allow both. You can calculate either using average or you can find out, or you can take initial. Why I prefer averages? In the numerator, you are taking what? Average. That means in denominator also ideally should be have average. That's more comparable in my view, but I say accepts both. Done, people? Alright. So how do you find out average? So again, I will discuss 3-4 techniques together. Sir, individually techniques ka questions will not come. If they want to ask techniques, these sort of techniques means they usually come for 7 to 8 marks. What they will do is they will give you a data. They will ask you to calculate 4 or 5 techniques together. One such question is there, we will take it up. So hence first conceptually we'll revise everything, then we'll apply it in one question. Okay. All right. So now, how do you find out average PAT, sir? To find average, if they give you 3 years profit, how do you find out the average of that? Add all the 3 years ka profit and divide by 3. If they give you 5 years profit, add all the 5 years profit divided by 3. Rather divided by 5, correct. Sir, in that 5 years, 4 years was a profit. 1 year was a loss. What you will do? 4 years ka profit you will add. The year which had loss you will subtract. Divided by 5. That's how you will get the average PAT. Simple. Okay. Then initial investment will be given to you in the question, no calculation. Average investment. Average investment. There was a simple way to calculate average investment. I don't know why. I say I did not like the simple method. They have given a fancy formula. And we will be using the same for our examination. So how do you get average investment, sir? Tell me. Opening plus closing divided by 2. Okay, let's take the small example. Let's say you purchased a machinery. Okay, now we are doing a decision. What decision? Whether to buy a machinery or not. Whether to buy a machinery or not. If you want to buy a machinery means how much you have to invest? 10 lakh. Salvage value is 1 lakh. Useful life, I've assumed it to be 9 years. What is depreciation every year? Original cost 10 lakh minus residual value divided by useful life. If you do, you will get depre of 1 lakh. Every year depreciation how much? 1 lakh. How many years will it last for? That means totally for 9 years depreciation is how much? 9 lakh. Sir, you bought the asset for 10 lakhs. So the opening balance of the asset was how much? 10 lakh rupees. At the end of 9th year, what is the closing balance of the asset? You bought the asset for 10 lakh. You depreciated it by 9 lakh. That means the closing balance of the asset is how much? 1 lakh. How do you get the average? How do you get the average? Opening balance plus closing balance divided by 2. Basically what? 10 lakh plus 1 lakh divided by 2, which is how much? 5,50,000. This is the average investment. Correct, people? This is how to calculate. So far, any doubt? Now, our ICI does not use this number. A simple way to calculate this is what, sir? What is this 10 lakh? A simple formula to calculate this is 10 lakh is your initial investment. And this 1 lakh itself is salvage value. Because under straight line method, closing balance of the asset will be equal to salvage value. That means express thus in formula. How do you get average investment? Initial investment plus salvage value divided by 2. They could have simply given this, no? Right? You know what ICA gives? Fancy formula. Half, open the bracket, initial investment minus salvage value, close the bracket, plus salvage value plus working capital. Calculate if you want. Half of initial investment. How much is initial investment? 10 lakh minus salvage value you do. Take your calculator. Initial investment minus salvage value you do. How much is that? 9 lakh. 9 lakh divided by 2 you do. How much is that? 4.5 lakh. Plus salvage value you have to do. How much is that? 5.5. Working capital will not be there, so it is 0. How much did you get? 5 lakh. Here also how much did you get? Same. Okay, this was much easier, no? But ICA prefers this method, so we will only follow this particular method in examination. Okay, Sarji. So what is the formula to get average investment? Half. Open the bracket. Initial investment minus salvage value, close the bracket, plus salvage value plus working capital. Because working capital also is an investment, which you have to invest initially. Hence, working capital you will have to add. In this method also, you have to add working capital if it is there. But don't follow this for examination. Okay, you follow this only, this particular formula only for examination. That's how you get average investment. So know how to calculate ARR then again. What's ARR ka formula? Average PAT divided by average investment, or you can take initial investment. One of the two choices. Done, sir? Alright. Sometimes what happens? The profit will not be given to you in the question. Profit will not be given to you in the question. So to find out ARR, we need numerator. What do you need in the numerator? Average PAT. But they will not give you PAT. They will give you cash inflows. They will give you cash inflows and they will give you cash outflows. Okay. So in that case, there is a workaround. There is another way to get profit. Profit is nothing but total cash inflow minus total cash outflow. Suppose they tell you in the problem that a project will last for 10 years. A project will continue for 10 years. For 10 years put together, totally you will get a cash flow of 10 lakh. Meaning every year you will get 1 lakh cash inflow for a period of 10 years. So total cash flow is how much, sir? 10 lakh rupees. For how many years? 10 years. To start the project, initially you have to invest 2 lakh rupees. I mean, this is a cash outflow. You will invest 2 lakh now. If you do so, how much you will get inflows for 10 years? 10 lakh rupees. So have they given profit in this problem or cash inflow and cash outflow? Like this data, they will give it to you. So total cash inflow is how much? 10 lakh. Total cash outflow is how much? 2 lakh. But for ARR, we need a profit. So how to find out profit is total cash inflow minus total cash outflow. What is total cash inflow? 10 lakh. What is total cash outflow? 2 lakh. Minus that. 10 lakh minus 2 lakh, you do. How much is it? 8 lakh. 8 lakh is your total profit. 8 lakh is your total profit. For ARR, we need total profit or average profit. How do you get average profit? Total profit divided by number of years. How much is the number of years here? 10. So 8 lakh divided by 10, if you do, you'll get 80,000. That's a workaround to get average profit. So these are the 3 adjustments that can come in the examination with respect to ARR. Okay, Saru? Can I move on? So these are all your non-discounting techniques. So they don't worry about the time value of money. So we don't need any discount factor, etc., etc. No present value concept, no discount factor concept. Straight away you apply and do it. Okay, this is foolish method because obviously can we ignore time value of money or we should consider? Sir, if you're doing project for 10 years means can you decide based on future cash flow or present value? Present value. So that's the reason these techniques are not preferred. These are only theoretical in nature for the sake of examination. Practically, more suited methods are your next techniques. Where is the next technique? Next techniques are called discounting techniques. For discounting techniques, we have to use discount factor and find the present value. This, you know it. We have applied it now only in marathon session. Those discounting techniques are net present value, your profitability index, and your IRR. These are all your discounting techniques. Tell me, sir. I have to tell you how to calculate NPV. No, you will in fact tell me. Yes, no. How do you calculate net present value? NPV is equal to how much? How do you calculate NPV? Present value of cash inflow minus present value of cash outflow. If you do that, you will get NPV. So that means you decide based on NPV. You decide based on NPV. So if they give you a particular, they give you data and say, should we buy the machinery or not? They'll give you the question like, if you have to buy the machinery today, we have to invest 10 crore rupees. From this machinery, we'll get so much of cash flow in the future. So you have to use that data and find out what, sir? NPV. And you can decide based on NPV. What is that decision rule? Simple. If NPV is positive, if NPV is positive, you can accept the project. You can accept the project. Meaning if NPV is greater than or equal to 0, accept. If NPV by chance, if it is negative, you reject the project. That's how you decide based on the NPV technique. Okay, Zaru? Alright, this is one. Next, profitability index. Profitability index, also known as PI. It has multiple names. You can call it as present value index, profitability index, or it is also known as a desirability factor. This is just an extension of NPV. How did we find out NPV? Present value of cash inflow minus present value of cash outflow. NPV or profitability index is present value of cash inflow divided by present value of cash outflow. Profitability index is given by the formula present value of cash inflow divided by present value of cash outflow. Okay. The decision rule is if profitability index, if it is 1 or greater than 1. If profitability index is 1 or greater than 1, you can accept the project. If profitability or present value index, if lesser than 1 means reject the project. Okay, fine. Sir, what if NPV is 0? If NPV is 0, you can accept the project. That's what I've written here. No? If NPV is greater than or equal to 0 means accept. If NPV is negative means reject. Okay. Why at 0 is, what is the thought process? Initially for 0, there was a different idea. Now, what is the thought process is? Sir, to find out NPV, we need what? We need find present value. To find present value, we need a discount factor. You know what we will take it as discount factor? Cost of capital. That is denoted by one symbol. Anybody remembers that? KO. We'll use KO as the discount factor. KO means what, sir? Return expected by the providers of finance. Here, who is doing this project? We. Company is doing this project. That means we are expecting, suppose KO is 15%. Suppose KO is 15%. I mean, this company is expecting a return of how much? 15%. This company is expecting a return of 15%. If they achieve NPV means they exactly achieved how much return? 15%. They expected minimum how much return? 15%. They achieved exactly how much return? 15%. That means if you achieve your expectation, suppose if you get exactly 300 if you get in your CA exams, will you write CA Inter exam once again or pass? Pass. Same. If NPV is 0 means you achieved what you expected. So you will accept the project. Okay, G. Alright, that's the thing. Same goes for profitability index. If profitability index is exactly 1 means accept it. Okay. Done. This is NPV is done. Profitability index is done. Can I move on to the next one? Next is IRR. IRR, so you will tell me, pa. What is IRR ka full form? You can call it as implicit rate of return or internal rate of return. IRR is a rate at which NPV is 0. That means your actual return. Okay, fine. So IRR is a rate at which AR NPV is equal to 0. So this IRR, how to find out, you already know. IRR is found out by assuming 2 discount factors, right? Okay, and you assume 2 discount factor and calculate NPV. Alright, if the assumed rate itself is IRR means, if whatever rate you have assumed itself is IRR means NPV should be 0. Will it be 0 or it will not be? It will not be. So you assume 2 discount factors and then you'll have to use interpolation ka formula. And that formula is IRR is given by the formula lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. This and all we have applied. No, same drama will come here also. That's all is about this IRR technique. Okay. And in fact, there's one more called discounted payback period. Discounted payback period. Sir, did we already calculate payback period? Yes. One of the disadvantages of payback period was what? Payback period considers time value of money or it ignores time value of money? Payback period ignores time value of money. Now we are calculating discounted payback period. Discounted payback period means it ignores or it considers. Considers. Payback period had a limitations. They had a disadvantages of ignoring time value of money. That disadvantages is sorted or it is mitigated through which method? Discounted payback period. Sir, how do you find out payback period? Walk me through. How do you find out payback period? We take payback period is simply a time, is a duration within which you will recover your initial investment. Under cumulative approach, how do you find out payback period? Tell me. First, you will take annual cash flows and then you will add them up. That added number only we call it as cumulative cash flows. Fine. You take cumulative cash flows and try to find a payback period. In discounted payback period, don't take cumulative cash flows. Don't take cumulative cash flows. First you take your cash inflows. First you take your cash inflows. This is what method is this? Discounted payback period. That means, can we take cash flow and find cumulative number? No. All this cash flow is on present value platform or future value platform. Whatever cash flow is there multiplied by the discount factor, you will get what, sir? Present value of cash inflows. All this will be cash inflows. Yes, people? Correct, no? You will get present value of cash inflows. From present value of cash inflows, find out what, sir? Cumulative present value of cash inflows and do your step. Instead of taking cash inflows and working with the data, take present value of cash inflows and then you do your payback period calculation. That's all it is. Just a shift in number. Instead of taking cash flows, you will take present value of cash inflows and do the same calculation ditto. Okay, that will not any which way same. Here also it will work under cumulative approach only. Why? Because every year ka, once you multiply discount factor, sir, is every year ka discount factor, first year ka discount factor same as second year discount factor? No. Since the discount factor for every year will change and present value of cash inflow, will it be same every year or it will change every year? It will change. That means you will have to compulsorily use which approach here? Cumulative cash flow. Just that instead of taking cash flows, you will have to find present value of cash inflows and do the calculation. I hope I don't have to explain it through any question on this. Got it, no? Easy? Okay. Alright, sir. Next, there is one more technique called MIRR. MIRR is Modified Internal Rate of Return. I'll explain, or 1 minute, hang on. Let's do a thing. Let's take up one question to cover all the techniques we have done so far. Then I'll go into MIRR. 1 minute. Where is it, pa? This one. Till now we have done some techniques. Give me a recap. What are the techniques we have gone through so far? In fact, techniques are broadly classified into discounting, non-discounting. Non-discounting techniques ka examples are or methods are payback period, payback reciprocal, it's just an extension, and then ARR, accounting rate of return, or also known as average rate of return or book rate of return. That is one. And then we looked at discounting technique like NPV, profitability index, AR, rather IR. Correct? So these are, and also discounted payback period. Now, those will get applied in this particular question. See, the expected cash flows of 3 projects are given below. So, good thing in this problem is cash flow we have to find or given. They only given. Awesome. So, cash flows for the projects they have given. And we don't have one project. We have 3 projects and all this data is given in thousands. The cost of capital is 10%. So, KO, that is the discount factor, is how much? 10%. One, calculate the payback period. We need to calculate NPV. We need to calculate IRR. And we also need to calculate ARR. Okay, then you'll have to give the ranking of the project. That's all it is. Fine. All right. Now, let's calculate the first thing, payback period. For 3 are there, 1 or 2, I will do it to get a basic idea. For all the 3, let's not waste time in doing it. So, just to get a brief idea as to how each method works, let's take up 1 or 2 methods. Okay. Now, if you just check first for payback period. For payback period, we need annual cash flows, annual cash inflows. You need to check whether that annual cash flow is same every year or is it fluctuating. Let's do it for project A first. Sir, year 0 mein, this is 5,000 negative. That means what? This is inflow or outflow? Outflow. To do this project A, year 0 mein or year 1 beginning mein, how much you need to invest? 5,000. If you invest means this project from year 1 to year 10, how much cash flow it will generate? 900. Is this number changing every year or same every year? Same every year. That means what, sir? To calculate payback period and all, should we have to calculate cumulative cash flows or not required? Not required. Payback period is simply given by the formula what? Initial investment, which is 5,000 divided by annual net cash flow. Annual net cash flow is same every year, which is how much? 900. If you do that, how much is the payback period you're going to get? 5.566 is the 5.56 is the payback period for project A. Okay. Let's do it for one more project, which is project B. Check here. To do project B, how much you have to invest initially? 5,000. And if you do this project, how much inflow you will get from project B? This value. Is it same every year or changing? If it is changing every year, can we use formula approach or cumulative cash? Cumulative approach. So first copy all the cash flows. That is given in the question. All the cash flows or cash inflows? Cash inflows from here to here you need to copy. That's what I've done here. Yes, all the cash inflows from year 1 to year 10 I have copied from the question. And then we'll have to find something called cumulative cash flows. Cumulative cash flow. For first year, what is a cumulative cash flow? Anything is there to add or only one number? One number. That means cumulative cash flow for first year is 700. For second year, it will be 700 plus 800, which will be how much? 1500. Then it will be 1500 plus 900, which is how much? 2400. Then it will be 2400 plus 1000. Like this, 3400. Like that, go on doing for all the 10 years. Easy. Sir, how much did you invest for this project B? The investment for project B as per the question was how much? Huh? Alright. Right. 5,000 rupees is your initial investment. Something happened here. Wait. What we have to do here? Have to use this. No, this also doesn't work. Check. Okay, something happened. I'll figure it out later. New software. I'm also not comfortable. Okay. Sir, how much did you invest? 5,000 rupees is what you invested. Alright. Maybe I'll take this. Ayyo, this is even worse. Or wait for 1 minute. This is giving trouble. Can I reduce sharpness? Ball pen. This is also not good. Brush pen. Not good. Ayyo, more than marathon. I'll have to worry about this today. Fountain pen. I take this. Ayyo, this also waste only. Che. Okay, let's reduce this or else. Wait. This is better. Finally. One thing I learned today. How to use this. Okay, coming back. Sir, how much did you invest for project B, sir? You invested 5,000 rupees. Okay, hey, what Buddhu they are telling. Yes, first time I'm using that. Till now I was using another software. That didn't work in Coimbatore. I don't know why. In Bangalore, I use different software. I can't use my iPad only. I'm using this now. Anyway, good thing is that I got to know new thing. But this is actually good. This software is good. Maybe I will use this only in Bangalore. But first, if I need to get comfortable with some options, I'll take that iPad today and figure out the options today. Maybe that's the homework for me today. Alright. So, now sir, is the cash flow. We found out cumulative cash inflows. Sir, how much did you invest for project B? 5,000 rupees. So that you have invested. So check in cumulative cash flow. Are we seeing any 5,000 anywhere? You're not seeing 5,000 anywhere. Okay. But hang on. 5,000 is lying somewhere between year 5 and year 6. So how do you get this? Tell me the formula. Payback period is lying somewhere between 5 and 6. So you'll take it as what? 5 plus required cash flow divided by actual cash flow. So you start with 5. Till 5th year, how much have you recovered? 4,500. How much you need? 5,000. From 4,500 to 5,000 if you do, how much cash flow you actually need? 500. Okay. Divided by actual cash flow. For 6th year, how much actual cash flow you achieved? 1,200. Do that, you will get the payback period. That's all. Done, Ji. Okay, this is the payback period for project B. For C, I will not do. I think you can manage that. You got the fair idea about this payback period now. For discounted payback period, will we take this and calculate? No. First, you multiply discount factor. Then you will get present value of cash inflow. Using that present value of cash inflow, find out cumulative cash flows and then do your same steps. That's all is a distinction. Okay, payback period, Damaru. Next, they asked what, sir? They asked ARR. Tell me, how do you calculate ARR? ARR is accounting rate of return given by the formula average PAT divided by either you can take initial investment or average investment. Anything is okay. So let's do it for project A now. First, let's do it for project A. Check, sir. Sir, for ARR, we need average PAT. We need average PAT. Have they given you PAT or have they given you cash flows? Cash flow. This is your cash inflow. This is your cash outflow. But they have not given PAT. How to find? Take the total cash inflow. Add all this. In fact, we have to add or we already did. For payback period, we already added. Right? For project, no, we didn't add. Okay, no problem. I think it's okay now. Every year anyway, it's same now. 900 every year for 10 years. So 900 into 10, if you do, automatically you'll get 9,000. Correct? So cash inflow is 9,000. Okay. Sir, how much is cash outflow? Cash outflow is 5,000 rupees. Okay. 9,000 minus 5,000 if you do, how much you are going to get? 4,000 rupees. 4,000 rupees is your total profit. We want total profit or average profit? Average. How do you get average profit? Divided by 10. So how much you going to get? 400 rupees. So 400 rupees is your average profit for project A. Easy. Average PAT you got divided by initial investment or average investment. If you take initial investment, what is the initial investment? 5,000. In that case, my answer will be 400 divided by 5,000, some percentage. I'll not prefer initial investment. I like to do it under average investment. Tell me, sir, what is the formula for average investment? Half, open the bracket, initial investment minus salvage value, close the bracket, plus salvage value plus working capital. So half plus initial investment for project A given as 5,000 minus salvage value not given, so 0, plus salvage value not given 0 plus working capital not given 0. If you do it, how much you going to get? 2,500. Average PAT is 400, average investment is 2,500. So 400 divided by 2,500 if you do, you will get average rate of return or accounting rate of return to be 16%. This is how to find out. Okay, Saru? Any problem? Okay. One more, can we quickly look through? Maybe for project B we will do okay. Sir, outflow is how much? 5,000. Have they given PAT or have they given cash inflows? Cash inflows. So add all this. In fact, for I think for payback period we already added. Yes, cumulative cash inflow we already found out. For project B, what is the total cash inflow adding everything? 11,500. So how do you get profit? Total cash inflow 11,500 minus total cash outflow, which is 5,000. By doing this, you will get total profit. We need average profit. To get average profit, you will divide by the number of years, that is your project life. By doing that, how much you going to get? 650. That is your average PAT. Divided by average investment. For your project B, how much are you initially investing? 5,000. So formula is the same. Half of initial investment minus salvage value, close the bracket, plus salvage value plus working capital. By doing that, you will get the answer to be 2,500. PAT is 650, average PAT 650, average investment 2,500. Divide these two numbers, you will get ARR to be 26%. So that's how to find out ARR. Clear? See, I will not do, you can take care of it. Okay. So we did what now? So far profitability index and we did ARR. Okay. Next we can, they also asked NPV and IR. So one method ka maybe quickly I'll do of NPV also just as a recap. Ideally NPV is not required. You know how to do it, but okay, 2 minutes just to be on the safer side. Now for project A. So check, sir. How do you find out NPV, sir? You have to find out present value of cash inflow minus present value of cash outflow. You start with year 0. At year 0, how much is your outflow? 5,000. And is inflows different every year or same every year? Same. If inflow is cash inflow is same every year, should we have to use PVIF or PVAF? PVAF. In the year column, what you will write? Year 1 to 10. And you write the value as what? 900 and take PVAF. At what rate? At cost of capital. How much is the cost of capital given in the question? 10%. So you have to use 10% as a discount factor. That's what I've done here. But year 0, the outflow for project A is 5,000. If you do project A for 10 years, for all the 10 years, every year, how much cash inflow you will get? 900. Discount factor is 10%. At 10%, we have, since the cash flow is same every year, we will use PVAF. How to find out discount factor? 1 divided by 1 plus I whole power n. 1 divided by 1.1 you do. Press equals to button 10 times and then press GT button in your calculator. You should be getting 6.1445. Alright. So this is your cash flows. This is your discount factor. Multiplying these two, you will get present value of cash flow. This is negative 5,000. These two multiplication will give you 5530. This is your present value of cash inflow. This is your present value of cash outflow. By doing that, you will get an NPV of how much? 530. Okay, Saru. Done. This is your NPV. They asked only NPV or also IRR. For IRR, we need 1 rate or 2 rate. Okay, first of all, is 10% my IRR. First of all, is my 10% my IRR. Sir, if my 10% was my IRR means NPV should have become 0. Is it become 0? No. This 10% is KO. 10% is expected rate of return. 10% is expected rate of return. When doing a project, you will always achieve expected rate of return or you can achieve more also. You can achieve more also, you can achieve less also. You thought you will get 320 in your CA inter examination, both the groups. Look at the lucky stars. You got 400. You thought you will get 320. You achieved how much? Your expected return was 320, but your actual achieved return was 4. NPV, to calculate NPV, we use KO. We use expected return. But IRR is the actual return. IRR is the Actual return. So if you so that means this 10% IRR, or it's not it's not your IRR. Someone is saying I'll get a rank, sir. Awesome. Now, is 10% my IRR? No. Anyway, for IRR, I need to assume 2 discount factor. One has already come. That means IRR ka calculation, I'll put up a separate table or continue in this. I can continue. I can save some time. One more discount factor I'll have to assume. Okay. So instead of 10, maybe I'll make it as 15. Sir, if you have to reduce NPV, sir, NPV and discount factor have ulta relationship. NPV is how much here? 530. From 530, it should become what? 0. That means NPV should reduce. If you want to reduce NPV, means you have to increase your discount factor. If you want to reduce your NPV, means you have to increase your discount factor. If you have to increase your NPV, means you have to reduce your discount factor. It's ulta relationship. Now here we want to increase or reduce NPV. From 530, we have to make it 0. If NPV have to reduce, means discount factor we have to increase. So that means next number, will it be 10 or more than 10? More than 10. You can take 14 or 15 or whatever. So I think for here I've taken it as 14%. At 14%, do you do the same calculation? Should I have to walk you through this calculation or not required? Not required. Okay. At 14%, you get NPV how much? 305 negative. So it is 0 or negative? Negative. That means IRR is somewhere between 10% and 14%. Now you use the data by plugging or by using interpolation formula. That's your here. Lower rate plus NPV at lower rate divided by NPV at lower rate minus high NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. By doing that, you will get actual achieved return, which is how much? 12.53. You expected how much? 10%. But you actually achieved how much? 12.53% from this particular project. That's all is a distinction between IRR and NPV. Okay. Yeah, I've done it for one more. I think this is good. No, IRR, NPV and all, we have done it in my other topics also. So no need to waste time, I'm thinking. Need a minute or carry on? Like this, they will give you one question. These are very easy questions, but time consuming. Because they'll not ask you one method. They will ask you many methods. So all this will come for 8 marks. So you have to solve within 20-25 minutes tops. 20 ideally. Okay, a little bit of a challenge. Easy only, but your writing speed should be really good. Anyways, it's okay. You'll figure it out. You're smart enough. I'm sure you'll crack it. Okay, so this is done. SM we can finish early, sir. You can probably think about me work on that side also. Yeah, I will not comment on that. SM paper I don't know. I've not gone through the syllabus. I don't teach that subject, so personally I have no idea about it. So I'm the wrong person to ask advice on that, because chumma for the sake of it, I don't want to tell anything. I have no idea. If I don't know something, I have a policy of telling I don't know. Better. Why to give unnecessarily falto advice and spoil someone's zindagi? Better than that, tell I don't know. I only teach this. Ask me this, I will tell you. Other things don't ask me. I don't know. Okay. Next one is MIRR. MIRR is modified internal rate of return. What is this MIRR ka concept is? Let's take the small example. First, we'll learn it with the help of an example. Then we will take up one question also for this particular area. Now, let's say, sir, you are doing, sir, you want to do a particular project. To do that project, initially you have to invest 20,000. At year 0, you need to invest 20,000. Discount factor is 10%. Discount factor is 10%. Okay. Now, sir. Now, doing this project, you will get cash inflow for 4 years, I've assumed. You have to invest 20,000 now. And if you do this project, you will get cash inflow for how many years, I've assumed? 4 years, I've assumed. 10,000, 15, 12 and 20,000. Now, this 10,000 when you will get? This 10,000 when will the company get? Year 1 means at the end of first year. This 15,000 company will get at the end of second year. This 20,000 company will get at the end of fourth year. Sir, suppose company gets any cash inflow in the first year of how much in this example? 10,000. Will they keep this 10,000 idle or will they reinvest? Now you are giving us the fees. You are attending our class and giving the fees. That means we got money. Will we keep that money idle or reinvest in our business? Instead of one batch, maybe we will do 2 batch. Maybe morning and evening batch we will do. Yes or no? That means if it's a profitable project, whatever cash inflow we get, will we keep it idle or reinvest in the project? Reinvest. Now this 10,000, when did you get? End of first year, and project will go on for how many years? 4 years. I mean, this 10,000 maximum you can invest for how many more years? 3 more years. Correct? No, because project will end on 4th year ending, and you got this at the end of first year. So this 10,000 you can invest for 3 more years. And if you invest, how much return are you expecting? 10%. Okay, Saru? What? Okay. Now means you tell me, sir. If you reinvest this 10,000 after 3 years, how much it will become? Meaning at the end of 4th year, how much it will become? Will it be 10,000 only? No. By investing 10,000, you will get extra return. How much? 10%. And you will get this extra return of 10% only once or 3? 3. Why? Because you are investing for how many years? 3 years. So take your calculator. 10,000 plus 10% plus 10% plus 10%. 3 times you do it. 10,000 plus 10% plus 10% plus 10 percentage. 3 times if you do, you will get how much? 13,300. So at the end of 4th year, at the end of project life, this 10,000 will become 13,300. Easy. Similarly, this 15,000, when did you get? This 15,000 company is getting at the end of 2nd year. Will the company keep this 5,000 idle or will they reinvest? When they reinvest, how much return are they expecting? 10%. Okay, that means what, sir? Will it be 15,000 or it will be more? You can invest this for 2 more years and get how much extra return? 10%. So that means at the end of 4th year, how much it will become? 15,000 plus 10% plus 10%. How much it will become? 18,150. Easy. Similarly, this 12,000, you got it at the end of 3rd year. You can invest this for how many more years? 1 more year. If you invest for 1 more year, how much return you will get? 10%. So 12,000 plus 10% is how much? 13,200. Yes, people. This 20,000, you got it at the end of the project. Can you reinvest or you cannot? That means this value will still be how much? 20,000. Correct? That means all these are value now or at the end of 4th year? All these are value of cash flows at the end of 4th year. Why 4th year? Because your project is ending at the end of 4th year. That value of cash flows at the end of the project only we call it as TCF or terminal cash flows. Okay, sir. Now add all this terminal cash flow. What is the total terminal cash flow you're getting? 64,650. Okay, sir. Yes. Now what MIRR is trying to calculate is, boss, if you get any cash inflow in any particular year, will the company keep that money idle or will they reinvest? Will they reinvest? When they reinvest, will it be same or this will become more? From 10,000, this will become 13,300. Like this, what is your total terminal cash flow? 64,650. Sir, you invested how much? 20,000. At the end of your project, your total cash inflow has become how much? 64,650. At what rate? At what rate? IRR is what? Tell me once again. IRR is a rate at which present value of cash inflow will be equal to present value of cash outflow. MIR is modified internal rate of return. MIRR is trying to calculate at what rate present value of cash outflow will be equal to present value of terminal cash flow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. That's what we're trying to calculate. That's a distinction between IRR and MIRR. IRR is a rate at which present value of cash inflow will be equal to present value of cash outflow. MIRR is a rate at which present value of terminal cash flow will be equal to present value of cash outflow. The way of calculating is same. Just that for MIRR, we need to find one extra fitting called terminal cash flows. And then you do your normal calculation. At what rate these two will be equal, you need to find out. And how do you find that? By assuming 2 discount factors and then using interpolation ka formula. That's all that steps same. But the only thing is you need to find extra called terminal cash flows. Did everybody understand this? Can we apply the same in one other question? Cool. Online also cool so far. Okay. Sir, now one way, I'll maybe tell this also. So there are multiple ways to calculate terminal cash flows. One is simple. Sir, this 10,000 you can invest for how many years? 3 years. And every year how much return you'll get? 10%. I mean simply take this number and add a 10% 3 times. Automatically you will get terminal cash flow. That's one way of presentation. Another way is, sir, we have the value 10,000 at the end of first year. We want the value at the end of first year or at the end of 4th year? At the end of 4th year, because the project is ending on 4th year. That means we have to find future value. Sir, we know this. What is that? Sir, if you want to find present value, what do we do? If you want to find out present value, we take future value and you multiply it by the discount factor. Yes, no, sir. This is how to calculate. Correct? Alright, once again, this drama happened. We take what, sir? We take future value and multiply by the discount factor. How do you get discount factor? 1 divided by 1 plus I whole power n. Correct? Now, this is what we are doing it. This we do to get what? Present value. Now, we need present value or we need future value? Now, tell me the formula, sir. To calculate present value, we take future value into 1 plus I whole power n. If you want to find future value, what you will do? You take present value and into 1 plus I. This will go to the numerator. So, it will become 1 plus I whole power n. This 1 plus I whole power n, I say calls this as reinvestment factor or future value factor. Instead of discount factor, we have to take future value factors. That is what, sir? 1 plus I whole power n. How do you calculate that? I say presents in this fashion. If you want, you can present in that way also. I feel this is simple enough. You can do this. But anyway, I'll leave it to your judgment what you want to do. Now, what is this reinvestment factor? Reinvestment factor is nothing but 1 plus I whole power n. I is what here? 10%. Sir, this 10,000 you can invest for how many years? This 10,000 you can invest for how many years? 3 years. That means here you will have to do 1 plus I whole power n. N is how much here? 3 years. 1 plus I is for 10%, which is 0.1. So, you'll have to do whole power 3. So, how do you calculate this? 1.1 into 1.1 into 1 point is equal to, you press, that's all. 1.1 into 1.1, go on pressing equals to button, you will get this formula. Okay, Saru, this is your reinvestment factor. From 10,000, if you multiply reinvestment factor, do it. 10,000 into reinvestment factor, this two you multiply, how much are you getting? 13,300. The same thing you'll get. So, subject to few small number of round off, that's okay. I feel this is the easiest. Okay. Or you can follow this reinvestment factor wala presentation which ICA follows. Okay, G. Now, next one. Let's go for one question. Where is it? Here, this one, check. An investment of 1,36,000. Sir, you have to invest how much? 36. 1,36,000 you have to invest now. That means this is year 0 ka outflow. Year 0 ka outflow. Okay. It yields the following cash inflows. Profit before depreciation but after tax. Read the sentence carefully. They gave what, sir? Profit before depreciation but after tax. Sir, before deducting depreciation, can you pay tax? Before deducting depreciation, will the company pay tax? No. What this means, profit before depreciation but after taxes. Tell me, what are the steps to calculate cash flow? Remember, I gave you steps initially. What are that? First, find profit after tax. How do you get profit after tax? Take sales and reduce all the expenses. You have to reduce depreciation also. Then you will get profit before tax. Then reduce the tax. You will get profit after tax. We need PAT or we need cash flow? Cash flow. Then we'll have to do 5 adjustments. In that first adjustment, what I told, add back depreciation. Correct? If you do that, we call it as profit before depreciation but after tax. What it means is you have taken PAT and added back depreciation. You have taken PAT and added back depreciation. If you do that, we call it as profit before depreciation but after tax. That's what this line. Okay. So what about other adjustments? Not there. That working capital, salvage value and all is not there. I mean, this only is what, sir? What they've given in the question itself is the cash inflows. So we don't have to find cash inflows. They've only done all the adjustments is what they're trying to tell in this problem. Everybody cool? Okay. Now, sir, you have to find, sir, what you have to find, sir? You need to find out MIRR considering 8% as cost of capital, not IRR. MIRR. Okay. MIRR, mein first step is what? First working note is to find out terminal cash flows. Multiple ways. Which one you want me to suggest? Addition wala? So, okay. Tell me, sir. How do you get this? This is your cash flow. What you have to do? We have to find terminal cash flow. Sir, first year, how much cash inflow are you getting? 30,000. This 30,000 you got it at the end of first year. Project is ending at the end of 5th year. That means, can you reinvest this 30,000? Yes. If you reinvest, how much return you're going to get? 8%. You can invest for how many years? 4 years. So, add 8% 4 times. 30,000 plus 8%, you added 4 times. If you added, how much are you going to get? your calculator should ideally show 40,814 rupees. Okay, that is one way to calculate terminal cash flow. Another way is reinvestment factor, which I've explained it to you. Okay, Saru? Alright, these are the cash flows given in the question. I've copied this. Okay, 30, 40, 60, 30 and 30. Now this 40,000 you got it when? At the end of second year. That means can you reinvest this? Yes, you can reinvest this for how many more years? 3 more years. If you invest for 3 more years, will this be 40,000 or it will become more? It will be more. How much extra you're going to get every year? 8%. So 40,000 plus 8%. 8% you'll add it how many times here? 3 times. Because you can reinvest for only 3 years. So it will be how much? 5388. This 60,000 you can invest for how many years? 2 more years. So 60,000 plus 8% plus 8%. This 30,000 you got it for at the end of 4th year. So you can invest it only for 1 more year. So it will become 32,400. This 20,000 can you reinvest or not possible? That means it will be only 20,000. All these are your terminal cash flows. So add everything. How much is that? 2,13,586 rupees. Any doubt in this calculations? In MIRR, first step is to calculate terminal cash flows. Don't do both. Either you do this or you do this reinvestment wala presentation. One, I've showed both. One, you follow whatever you feel comfortable. ICA follows this. Okay. If you feel this is little boring for you or not that much interesting, you can go for this easy method. Your choice. Okay. Tell me, IRR means what? IRR is a rate at which present value of cash inflow will be equal to present value of cash outflow. Are we calculating IRR or MIRR? Tell me again, MIRR ka what is the thing? MIRR is a rate at which present value of terminal cash flow will be equal to present value of cash outflow. Okay, that's what we have written here. MIRR is a rate at which present value of terminal cash flow will be equal to present value of cash outflow. How much is outflow is given in the question? 2,36,000. We have to find out the present value. We have to find out MIRR. For that, what is the step, sir? Same. Assume 2 discount factor. Same. Year column you write, year 0 column. Year 0 mein how much is outflow? 1,36,000. Then terminal cash flow. Terminal cash flow will come every year or once? Once. That to when? At the end of the project. And this project is ending in 5th year. And the total terminal cash flow is how much? 2,13,586. Okay, Saru. Now we are testing. First, let's test it at 10% only. Because anyway, discount factor was given at 10%. 8 they gave. Okay, no problem. I put it up at 10. If you want, you can start with 8 only. Absolutely no issues. Okay. Now I'm trying to test whether 10% is MIRR. For year 0, the discount factor is always 1. At 10%, you have to find PV of Guru. Every year, are you getting this or once? One. At the end of 5th year, your total cash flow will become 2,13,586. Every year, are you getting or once at the end of 5th year? At the end of 5th year, all the cash flow, total my cash inflow will become this value. That means we have to use PVIF. At 10%, use PVIF for 5th year. 1 divided by 1.1, press equals to 5 times. You should get 0.6209. Done, Saru? Then the same step. These two multiply, you will get present value. This is present value of cash outflow. This is present value of cash inflow. When you sum it up, are you getting 0? You're getting negative. You're getting negative. Sir, we want negative or we want 0? We want 0. Sir, ideally for IRR calculation, one NPV should be positive, one should be negative. That will give you a close-up answer. And that should be as close as possible. Now we got already one negative. We want now positive number. That means discount factor you have to reduce. Because if you increase the discount factor, NPV will go on reducing. Now we have to increase the NPV. Yes, no? That means instead of 10%, I'll make it as 5%. Okay, Saru? Now let's test it at 5%. Same. At 5%, if you find a PVIF, it will be this. This is your discount factor. This is your cash flow. Multiply, you'll get the present value. And adding all the present value of cash flows, you get 31,344. Did you, sir, if 5% was my MIRR means this number should have been 0. Is it 0? No. That means MIRR is lying somewhere between 5% and 10%. Now plug in the formula, interpolation formula, lower rate plus that NPV at lower rate and all that. You will get the answer. So MIRR is how much, sir? 9.51%. In this step, I think you're comfortable. No? The only change in MIRR is finding the terminal cash flow. Rest every step of IRR and MIRR is same. That's it. So all this will come in exam, sir. Less than 5 marks, possible. Anything more than 5 marks, these sort of questions are not examiner's favorite. I'll take up 1 or 2 questions which usually are expected for more than 5 or 7 marks or whatever. Discount factor, we should take GT. Only if you're finding PVAF, you have to press the GT button. Here, this is fifth. We need fifth year ka discount factor. Fifth year ka discount factor means PVIF. For PVIF, don't press the GT button. GT means grand total. Okay. We don't need the total here. We need fifth year ka only. Hence, GT not required. Okay. This is done. No. Next, what? Okay. This part I've covered. Next, what? G. Next, some special cases. Okay. Maybe I'll first discuss of this and come to the special cases. Okay. The decision rules. Decision rule. Few things you already know. Sir, I want to do a single project. What is the decision rule for NPV? If that project is giving me 0 or more than 0 ka NPV. If NPV is greater than or equal to 0, you can accept the project. If NPV is negative, means reject the project. Okay. If you are analyzing or assessing for individual project, NPV should always be 0 or greater than 0. If it is negative, reject it. Okay. Suppose you are selecting for multiple project. You are selecting for, or maybe first I'll do it for individual project. If NPV is 0 or greater than 0, accept. Similarly, profitability index, what is the decision rule? If it is 1 or greater than 1, accept. Lesser than 1 means reject. IRR, what's it? IRR is actual return. For you to accept the project, actual return should be at least equal to expected return, or it should be greater than expected return. Expected return, we call it as KO. That means what is the decision rule? You tell me. IRR, if it is greater than or equal to KO, accept the project. Otherwise, reject it. Because KO is the expected return, IRR is the actual return. If the actual return is same as expected return, you can accept it. Or if it is greater than expected, you can still accept the project. Like that. This is a decision rule based on discounting techniques. What about ARR? What about ARR? ARR is what? Average rate of return. Sir, you have one project. Whether to do the project or not, you have to select based on ARR. What is that? Sir, when you're doing a particular project, internally you will have some deadline. That by doing a project, I want a return of 10%. Now, I as a company, I want to take up only that project which gives me a return of 10% or more. Now, ARR is 15%. What will I do? ARR is a return. ARR is a return. Minimum, how much am I expecting? 10. How much is my ARR? 15. Reject or accept? Accept. That means what is the decision rule? If, excuse me. If ARR is higher than the expected return, you can go ahead and accept the particular project. That way. Okay. And if you have to decide based on the payback period, what is payback period ka definition? In how many months or in how many years you will recover your investment. That recovery should happen at the longest time or the shortest time? Shortest time. So again, when you're doing a particular project, no sir, internally you will have some deadline. Let's say I want to do a particular project. If it recovers my investment within 3 years, I want to do that project where I can recover my initial investment within 3 years. My payback period is 5 years. Payback period is 5 years. Internally, what is my deadline? I want to recover my investment within 3 years. Internally, this is a deadline company has. But a particular project ka payback period is 5. Accept or reject? Reject. Okay. That means what is the decision rule? If the project ka payback period is lower than expected period for individual project, you accept it. If payback period is more than the expected period, then you reject the particular product. That's how you do the selection for individual projects. Okay, sir. Now, sometimes they will not give you individual projects. They will give you multiple projects. They will give you 2 projects, project A and project B. You'll have to select one among the 2. Either you have to select project A or you have to select project B. How will you select? Sir, how will you select based on NPV? If you have 2 project means you'll always select that project with the highest NPV. Similarly, if you have to decide based on profitability index means whichever project has the highest profitability index, select that. Similarly, based on IRR also, whichever project has the highest IRR, select it. Same goes for ARR also. ARR is also a return. If they give you 2 projects ka ARR, you'll always choose that project which has the highest ARR. Done. But if they give you 2 projects and you have to do the selection based on payback period, means you will select the highest or the lowest. Sir, payback period means then how many months you will recover your investment. You want ideally the number to be as low as possible. So if you have to select the project based on payback period, you will always select that project which has the lowest payback period. That is a decision rule of the particular project based on these sort of techniques. Okay, this is done. Next are some special cases, couple of special cases. Okay. Next technique is not technique actually, it is some special cases. It is just an extension of some of the things that we have learned. Like an extension of an NPV, you could say. Capital budgeting under capital rationing. Capital budgeting under capital rationing. So to ration something means doing the decision safely, or quite, you are taking the decisions on a safe manner, or being a little more careful. What is this is, let's take an example and try to understand that. If you understand this example, you don't need any next question at all. Okay. Let's say, sir, we have three projects. Three projects. A company, no, sir, has a budget of 1 lakh. They have a budget of 1 lakh rupees. Okay. And they want to do projects. They want to do every project which can fit within the budget. And what is the maximum budget? 1 lakh. Whichever project can be done within 1 lakh, they want to take it up. Now, company has three options. Either they can take project A, B, or C. If they want, they can do all the three also. It's not just they have to select one. They can do more than one also. Okay. If they want, they can do only one, or they can do all the three. But hang on. If you want to do project A, initial investment required, I've assumed is 50. If you want to do B, initial investment required is 40. If you want to do C, means investment required initially is 25. Add all these three. How much are you getting? 90 plus 25, it is 1 lakh 15,000. To do all the three, we need 115. Do we have 115 or we have only 1 lakh? Okay, we have, that means we have a budget shortage. So that means within the budget available, you have to select the project. This scenario, we call it as capital budgeting under capital rationing. Okay. And moreover, if you just check every project ka outflow, is it same or different? Oh, I've given you this data. Okay. There's a solution. Don't worry about this part. Okay. This is the data. This data will be given to you in the question. They will give you initial investment. Also, they will most probably also give you NPV. Sir, if you do project A, how much NPV it will generate? 15,400. Data given to you in the question, not calculated. B ka NPV is 18,700. C ka NPV is 10,100. Sir, ideally, what is the rule? If you have multiple projects, means you will select that project with the highest NPV. Correct. That's a basic rule. But all this project ka outflow, is it same or different? That means doing the selection based only on NPV would not be appropriate, because their outflow is same or different. Hence, since the outflow is different, no, you bring everything to one platform. What is that platform is? Very simple. Sir, let's look at it this way. Sir, project A ka outflow is how much? Initial investment is how much? 50,000. If you invest 50,000 now, how much NPV you will get from project A? 15,400. For 50,000 outflow, project A will generate an NPV of 15,400. Correct? All these outflows are on same platform or different? I'll bring it on same platform. I'll bring it on 1 rupee platform. You can bring it to 100 rupees, 1000 rupees, doesn't matter. For easier calculation, I will take 1 rupee. Sir, if 1 rupees outflow means how much is NPV? For 50,000 rupees outflow, NPV is 15,400. For 1 rupee outflow, how much is the NPV? Calculate. How do you get X? X is equal to what? 15,400 divided by 15,000, you'll get how much? 0.308. So if you invest 1 rupee for project A, it will generate how much NPV for you? 0.308. Okay, sir. Same thing you calculate for project B also. How do you calculate that? Basically, NPV divided by initial investment. NPV of this is 18,700 divided by 40,000 euro. How much is it? For 40,000 outflow, NPV is 18,700. For 1 rupee outflow, how much is NPV? That's what I'm trying to calculate. That's given by 18,700 divided by 40,000. How much is it? 0.47. Correct? Same thing for project C. For 25,000 outflow, NPV is 10,100. For 1 rupee outflow, how much is NPV? 10,100 divided by 25,000, you do. How much is it? 0.4. Now, every outflow is same. They are all on which platform? 1 rupee platform. Correct? No? Now, you do the selection. How? Check. Sir, if you invest 1 rupee in project A, how much NPV it will generate? 0.30. For same 1 rupee outflow, B will generate 0.47 extra. And C will generate 0.40. Now, based on this, you assign the ranks. So, for 1 rupee outflow, which project is giving me the highest NPV? For 1 rupees outflow, which is giving me the highest NPV here? Project B. The first rank will be given to B. Next, which is giving the highest NPV? C. So, second rank will be given to C. We have 3 projects, so maximum rank will assign is 3. So, third rank will be assigned to project A. So, in this order, you will do the particular project. In this order, you will do the project. This scenario, we call it as capital budgeting under capital rationing. Easy. Okay. So, first rank project is what, sir? B. So, if your budget is 1 lakh, means first company should take a project B. And to do project B, how much money is required? 40,000. How much NPV we will get? To do project B, we need 40,000, and by doing project B, we will get an NPV of 18,700. Sir, budget over or still is left? Sir, in 1 lakh, for B, we invested how much? 40,000. How much money still remaining? 60,000. I mean, we still have money here. So, can we take up more project? Yes. Which is a second rank project? C. I mean, next you will do project C. To do project C, how much money we need? 25,000. And by doing C, how much NPV you will get? 10,100. Okay, sir. So, how much money you utilized? 40 you utilized for B, 25 you utilized for C. So, totally how much you utilized? 65. How much budget you have? 1 lakh. Fully exhausted or still there? How much money still there? 35,000. 35,000. What is the last ranking project? A. But to do A, how much money you need? 50,000. You have 50,000, you have only 35. You have 35. Now the question will tell. You know what they'll tell? Projects are divisible. They will say projects are divisible. Projects are divisible means you don't have to do full project. You can also do 10% of the project, 20% of the project, or 40%. Whatever percentage of the project, if you want, you can do. That's what we mean by projects are divisible. Projects are divisible means you don't have to do 100% of the project. You can do lesser. Okay. So, to do 100% of project A, how much money I need? 50,000. Do I have 50,000 or only 35? 35,000. That means I will invest only 35,000 if project A is divisible, which will be given to you in the question. Most probably, they will give you divisible only. If it is not divisible means, then can you take part project or not acceptable? In that case, A you cannot do, you can only do B, C. You'll have to check various permutations, combinations there. Okay, G. Divisible is more popular in examination, hence I'm covering that. Okay, if it is divisible, can you invest only 35 and do this project? Yes. And now they were made, don't write 15,400 NPV. Sir, if you want to get 15,400 NPV, you have to invest how much money? 50,000. Are you investing 50,000 or only 35? Sir, you will get an NPV of 50,000 provided you invest 15,400. But you are investing only in project A, how much? 35,000. For 35,000 outflow, how much is the NPV? You have to prorate. Understood? Once more or okay? Okay, so calculate this X, how much is it? 35 into 15,400 divided by 50,000 if you do, you'll get 10,780. So that means you will get an NPV of project A only 10,780. This way, entire 1 lakh got invested and this much NPV you have generated. That's all. This only they will give it to you in wordings by adding more garam masala. You'll be able to take care of it. Problem not required. Manageable. Workage. If you need a minute, I'll give you a minute to review. Next question is it? Okay, next concept is another special concept. Projects with the unequal life. They will tell you in the project, they will tell you in the question, you have to choose one project. You have two options. It could be two or more also, whatever. Okay. But you have to choose only one. You have to choose only one project. Okay. Like, let's say over here, let's take this example. We can either do project X or we can do project Y. To do project X, we need initial investment of 10 lakh. Y ka initial investment also I have assumed it to be 10 lakh. If you do project X, you will get an NPV of 15 lakh. If you do project Y, you will get a total NPV of 90 lakh given. Okay. But this project X ka life is 4 years, Y ka life is 5 years. But stop here. This is a solution. This data, they will give it to you usually in the problem. Okay, Saru. Now, ideally, what is the decision rule? What is the decision rule of NPV? If you have multiple projects based on NPV, what is the selection rule? You'll select that project with the lowest or highest NPV. Highest NPV. Which among this is having the highest NPV? Why? Correct, no. But here, applying that rule blindly will not help. Why? Sir, X will only last for 4 years. Y will last for 5 years. That means is the life same or different? Obviously, if Y has 1 year extra life means Y will obviously give you one extra benefit. Correct or no? So that's the reason, should we ignore this or consider this? So hence we can't apply the normal rule. Normal rule is you will select that project with highest NPV. But to apply normal rule, your life should be same. Is it same or different? Different. When the lives are, this only we call it as projects with unequal lives. In this case, maybe we have to find something called EAC, equivalent annualized criterion. Okay. What is this? Fancy name, but very simple funda. Sir, NPV, no sir, in this case, NPV is how much? 15 lakh. 15 lakh is the NPV for the project life of how many years? 4 years. What is the average NPV? You need to find out. 15 lakh is the NPV for 1 year or 4 years? For 4 years, because the project will last for 4 years. No, for 4 years, the NPV is 15 lakh. For average, how do you find out average? 15 lakh divided by 4. 15 lakh divided by 4. Do that. How much are you going to get? 15 lakh divided by 4. If you do, you will get 3 point something. 3 lakh something. Correct? That you should not do. Why? Sir, if you do 15 lakh divided by 4, you will get this particular number. Sir, this NPV techniques ignores time value of money or considers? NPV technique. NPV technique ignores or considers? Considers. Sir, if you take simple average means automatically you are ignoring time value of money, because getting 1 lakh in first year and getting 1 lakh in second year same or completely different? Completely different. Hence, we can't do simple average here. We can't do simple average. Yes, we have to find average NPV. EAC is nothing but finding average NPV, but you can't find average like this. How to find averages? You have to consider time value of money concept. You have to consider time value of money. How to do it? Sir, in the question, they will tell discount factor. They will give it to you in the question. 10%. Okay. Now, what is this project X ka life? 4 years. What is the discount factor? 10%. At 10%, find out PVAF. Find out PVAF for 4 years. Tell me, how do you get that? 1 divided by 1.1. Press equals to button 4 times. I need PVAF. So press GT button also. If you do that, how much is your PVAF? 3.169. Okay, sir. Sir, why you should not take PVIF, sir? Sir, this particular NPV is for 1 year or all the 4 years put together? This 15 lakh is a NPV for all the 4 years put together. That means we should consider PVIF to find out average NPV or PVAF. PVIF means that year ka discount factor. PVAF means all the 4 years ka discount factor. Since this is all the 4 years ka NPV, we have to take all the 4 years ka put together discount factor, which we call it as PVAF. Now consider this and find out average NPV. Okay. How do you get average NPV? Simple. NPV divided by PVAF you do. NPV divided by 15 lakh divided by 3.1698 you do. How much you going to get? 15 lakh divided by 3.1698 if you do, you will get 4,73,216. That only we call it as EAC, or in simple terms, you can call it as average NPV. Yes, people. Okay, G. Alright, this is the average NPV. Now, same thing you'll have to find out of your project Y also. Project Y, you help me out. How will you calculate? Same, discount factor is same, 10%. How will you calculate? Simple. EAC is given by the formula NPV divided by PVAF. What is the PVAF? At what rate you will find out PVAF? 10%. But hang on, not 4 years. You are now calculating PVAF for average NPV for project Y. Y ka life is 4 years or 5 years? 5 years. At 10%, find out PVAF for 5 years. That's the project ka life. So 1 divided by 1.1 prints equals to button 5 times and then GT button. How much is that? 3.79. Okay, like that. That was that number. Okay. So how do you get EAC? NPV divided by PVAF you do. So 19 lakh divided by 3.79 you do. How much is that? 5,01,227 is probably the close enough number that you're getting. Yes, no? Correct, sir? Both are average NPVs. Both are average NPVs, right? Now you will do the selection based on average NPV. On an average, which is giving you the highest NPV? On which has the highest average NPV? Y is having the highest average NPV. That means you will select which project? Project Y. So you will do this EAC only when what, sir? Only when the life are not same. Otherwise, this EAC drama and all is not required. Same, normal step. This here may only one extra working note will come. First, you have to calculate your normal NPV. But you can't do the selection based on NPV because project life same or project life different. Since project life is different, we have to find average NPV. That only we call it as equivalent annualized criterion, or you can simply call it as EAC. How do you calculate this EAC? NPV divided by that project ka PVAF. That project ka PVAF. That way you will get average, you will get EAC, and you will select the lowest or the highest EAC. You will select that project which has the highest EAC, which in this project, in this case, you will select project Y. Done, sir? But don't mug it up. What is that mugging up? Sir, you select that, find EAC, sir. Whichever project has highest EAC, select, sir. No. Sometimes what happens, sir, here they have given what data? NPV data. Some problem they will only give you cost data. They will only give you cost data. Right? Like, look at this example. Two machineries a company has an option to purchase. Either they can buy machinery A or machinery B. All these are questions we have done in regular class. If you take full question, it will take 5-10 minutes extra. So I have written a small example to cover the concept quickly. So don't freak out to saying how and all that stuff. All entire thing, whatever we have discussed is done. In the class notes, you will find this chapter. I think we have done more than 50 questions. Probably more than that. I don't even remember. Yeah, we spent almost like 6-7 days only for this topic alone. Anyways, look at this. Machinery A ka running cost is for how many years, sir? 4 years. Sir, if you have any machinery means, can you just purchase the machinery and keep quiet, or you have to incur some repairs and maintenance? You have to incur some repairs and maintenance. So for machinery A, you have to incur maintenance cost for 4 years. For B, you have to incur maintenance cost for 5 years. Now same or different? Different. Okay. And present value of cash outflow is 10 lakh. Usually they will not give present value of cash outflows. They will give you outflows. They will give you outflows. We have to find present value of cash outflows. How do you get present value of cash outflows? Outflows multiplied by the discount factor. That anyway you know. But in this I have only given. How much for machinery A ka outflow? 10 lakh. Machinery B ka 11 lakh. Okay. Now sir, you have to do the selection. You have to do the selection. Only this data will be given. Inflow ka data will not be given. They only give outflow and more outflow. Correct? Now, sir, NPV is a benefit. NPV is a benefit because how do you calculate NPV? Present value of cash inflow minus present value of cash outflow. Correct? So if NPV is positive, you will accept the project. When will NPV be positive? When present value of cash inflow is greater than present value of cash outflow. Yes, sir. Now here, can you calculate NPV, or it's only the outflow data that they've given? Outflow data they've given. Sir, if you're doing the selection based on NPV, you'll select that project with the highest NPV. Here you're working from benefit angle or cost angle? Cost angle. When you're working from cost angle, you'll select that project with the highest cost or the lowest cost? Lowest cost. Which has the lowest cost? Which has the lowest cost here? 10 lakh, that is machinery A has the lowest cost. Correct? No? That ideally we should select which project? Project A. But hang on. A ka life is how many years? 4. B ka life is 5 years. Life same or different? In case of unequal life, can we just compare this, or we have to find EAC? You have to find EAC. EAC can be average benefit, or it could be average cost. Here it is average benefit or average cost? Average cost. How to find EAC? Same. There you took NPV divided by PVAF. Here you will take present value of cash outflow divided by PVAF. PVAF at 10%. In fact, you can calculate. At 10%, tell me what is a PVAF. At 10%, what is PVAF for machinery A? Machinery A can last for 4 years. 1 divided by 1.1, press equals to button 4 times, and then GT. How much you going to get? 3.169. Similarly, for machinery B, calculate PVAF. 10% is a discount factor, but B will last for 5 years. So what you will do? 1 divided by 1.1, press equals to button, 5 times, and then GT button. How much is that? 3.790. Now calculate EAC. How do you get EAC? Here NPV, or you have to substitute. Instead of NPV, what you will substitute? Present value of cash outflow divided by PVAF you do. That's what I've written as 2 divided by 3. These took a division you do, you will get this. These took a division you do, you will get this number. Now you will do the selection based on highest EAC or lowest EAC. Lowest average cost. Which is having the lowest average cost? Machinery B. That means the final selection is you select machinery B. Done, people? That is what I've written in the chart here. When you are working from EAC angle, check whether are you working from inflow angle or cost angle. If you are working from inflow angle or MPV angle, means you will always select that project with the highest EAC. If you are working from cost angle, you will always select that project with the lowest EAC. That's all. So both the types of questions have come in the examination. One case may they have given NPV as a benefit, another case may they have given only cost. And they had unequal life. Okay. Now I think you basically clear about this EAC. Not required for any problems. No. Revision is good enough with this example. You have completely got it. Question is there in your study material on all this. If you want, you can pick it up and do it, or in our class notes also we have done. Both these questions are available in our class notes. Okay, this is done. This one fully done. Next, this one I'll take care of it in problem. This one also I'll explain it in problem. Okay, sir. All right. Now, sir, I'll tell you, if they want to ask more than a 5-marker question, 7-marker or a 10-marker or a 12-marker, there are few questions. We have done at least like 8 to 10 such question in our regular class. Okay. They'll be very, very lengthy. 2-page ka question, 2-page ka, 3-page ka solution. But concept is pretty easy. I'll take 2 questions now, such questions, and explain you all the concepts which usually comes in from those particular concepts. Okay. So I think all the majority of the concepts we have done, just 1 or 2 adjustments. Okay, specific adjustments. I'll have to explain it to you with the help of questions. 1 minute. Let me find that question. Again, as I told, majority of the question I picked from study material only, so that it'll help the general audience. Because I don't know. I mean, I'm little surprised initially, sir. Actually, I mean, just 2 minutes. I'll probably speak. Okay, is it okay? Yeah, do, sir. This one you leave, sir. That you still. Sir, initially, no, one and a half years back or something, I think the team was saying, do marathon, no. They're saying, do marathon, like, why are you not doing marathon? I was of the big belief that, why will people watch marathon? Why will people watch marathon? Because, see, sir, marathon is a revision. So, right? So, in marathon, what, sir, 130, 140, FM ka 130 hours content, I have to summarize within 14 hours. Now means I have to speak fast, right? I'll have to assume like this, see, I can't solve full question. I have to construct small examples and all and do it. I thought, which students will be interested in all that? Let's not do it. But later on, we started getting so many inquiries. In fact, people saying, I'll not buy your class if you don't do marathon. Like, hey, what? That too much craze. Okay, I thought I'll give it a shot. Then when I did one last marathon of advanced accounting only, I got to know what craze actually people have for marathon. Looking at the comment, then I realized that I have to focus more on the marathon, not to increase my revenue. Because comments were like, sir, I will watch this marathon, will I pass? I will just watch this marathon, sir, will I pass? I was like literally shocked by the attitude. Sir, advanced accounting is almost 220 hours. Though marathon I did for 30 hours, that is only 15% of the syllabus, sir. Right? No. People are saying I will only watch 25 hours ka video and they want full exam to be passed. Then I realized that this marathon only I have to do it little more detailed way, otherwise go in the. Then I realized that this particular generation is more like a shortcut. We don't want that 200 hours and all. You give 15 hours, 20 hours, you tell everything, we will do that much and we will clear. Anyway, that's the reason even FM marathon also initially, first time when I did FM marathon, it was for 7.5 hours or 8 hours. Then I realized, this will not work. Next one I did it for 14. I think this will come close to 16 or 17 now. Even FR marathon also. Initially I planned for 20 hours CA final. It went for 31 hours or something. Okay, I don't know. Every attempt my marathon is going on. Maybe after 2 years, no, my marathon and my regular class will be same. Okay, come people, 10 days we will sit and we will do marathon. Okay, probably that day is not far away, I feel. But anyway, on a serious note, people, I think you need to like put some efforts also. Okay, you can't just be like, I'll only do this, I'll only do that much, like, and help me clear the examination. That is not the right approach in my view. Because sir, examination somehow, sir, whatever question I'm doing now, lucky you, lucky me, same question came. Then I will become superstar. You'll promote left, right, center. Hey, watch that guy marathon. That guy's crazy. He does something and all. Came my partner. Okay, I will become superstar. I will get more money. But after you qualify as chartered accountant, that same attitude will carry. Instead of 100 hours, your mentality will be like, can I do only 15 hours? Can you tell your client? Well, client will give you an assignment. He'll say, I will not work for 10 days. I'll only work for 2 days. Give me full fees. Give me full fees. Will that work? No. So that attitude overall is wrong. So you need to put some efforts. There is some fun in that, people. Don't look at studies as a very negative things. We have that strong framework means the moment we open book, we will that wala feelings. Someone else and all will start coming to our memory. My auntie's daughters or this, that somewhere. Whom you are not even related, all that so many years memory and all will come back. We are least interested in studies and concepts. Our mind will keep running in every direction. After passing, no, I will go there. I will do that. We will just go on drifting. Okay. But you need to get your focus back on things. There's fun in that. See, to control mind, it's a kick in that. You'll have to try it sometime. Okay. There is a challenge. Take it as a challenge. One day you will sit for 14 hours. I'll see what will happen. Have you tried? See, it's not a big deal. See, I ask this question in my regular class. When someone says, sir, how to study long hours, sir? Studying 8 hours, 9 hours and all is very difficult, sir. I ask that person, how many hours do you watch Instagram? 6 hours. 6 hours was the response. A person can lie down in the same room, on the same bed. They will not move an inch also. This also no. That you can do it for 6 hours. But studying, you can't do it for 8 hours. If you ask to sleep, you're sleeping in your own house, in your own room, in your own bed, in your own cot. Some guys don't even change their bed sheet also. Same bed sheet for years together. 8 hours, 10 hours, you'll sleep every day. You're not bored. Daily you do same activity, no sir? You eat also. Correct, no? Daily you're eating. From if you are aged 20 years means since 20 years you've been eating. That too, you're not even eating in your left hand. Same hand. Going on. That is not boring. Studying 8 hours per day for 1 month is boring. Why? We have not thought in that direction. Okay. For us, we have understood. Because in our classroom, our teachers told, you mug it up, you do this. So it became an activity like, this means I have to just do some random things. I will get some marks. I'll get some degree. So we have a strong inclination or a notion that studies are very, very boring. Boring or not, okay? It's important to have focus, all right? So bring back that, throw that old mentality, take it as a challenge. Okay, I'll try. If you're looking to pass, aim to get a rank, challenge yourself. There is fun in that, okay? So it's always good, sir. So if you're interested in game, if you're interested, let's say in cricket, you want to score only 10 runs or you want to score half century or century. There is fun in that, no? By hitting a 6, you get kick out of it. Same goes with your studies also. If you're looking to pass, don't aim for a pass. Aim for an exemption. Aim for a rank. There is always that kick in pushing yourself. That cannot be explained. It can only be felt. Okay? It will be hard. Definitely, for whom it is not hard. Do you think if given a choice, I would take 6 hours non-stop marathon? Do you think it will help my throat? Literally, after this class, I will not take class for 1 more week. Because I need 1 week to recover. Because continuously speaking is difficult. But there is a kick in that. Because you're pushing yourself. When you push yourself, you'll know your boundaries. Right? So once in a while, we should push our boundaries. So it is okay. Alright? So take that negative mindset out. Get into the positive frame of work and think that I will try. 1 month is there means I will give my best. Whatever it is, I'll try. 14 hours. Sleep means even I'll sleep for, instead of 10 hours, I'll sleep for 6 hours. I'll see what will happen. Like that, challenge yourself. Let's see what outcome comes. When your mindset becomes like this, I'm pretty sure CA just becomes a childish examination. You will pakka clear it. Maybe 1 or 2 attempts you may take at best. Okay, but still the degree though definitely will come in your hands. Okay, all right, I think too much. All right, sir, don't cut this part in YouTube also. Okay, that I leave it to the editing team. Someone is saying, sir, first we did self-study and watched your marathon, it cleared. that is there. I've heard so many comments about that. But anyway, that's the reason I have taken that marathon activity a little more seriously. Earlier, I thought it was just a revision. So now I know that many students, how they are using marathon. So that's the reason even I am trying to do as detailed as possible. Anyways, so this is clear. So let's take up now some exam expected question. A type of examination question. I'm not saying this only will come. These kinds of questions we can upload it. Yes, it will be uploaded on YouTube after some time. Give us some 3-4 days time. It will be uploaded. Okay. Let's review this question now. It's already one. Okay. Time is okay. Navjeevani, one hospital is considering, or one second, hang on. Let's have that recap. Sir, all our techniques use profit or cash flows? Cash flows. Till now, whatever problem we did, cash flows was given to us. Cash inflows was given to us. In examination, what is the only thing they will do is cash inflow, they will not give. Cash inflows will not be given. So we need to find. And how to find out or how to estimate that cash flow, we have a format we just now discussed initially. That format application is here next to 2 or 3 problems or whatever. Tell me, sir. Let's retrace our memory back. First, we start with what? Sales. From sales, you have to reduce. No need to worry about format. We just need what? Cash flows. And this is a working mode. So from sales, you can reduce all the expenses. You don't have to give fancy name like variable cost or fixed cost and all. Simply, you can write sales minus expenses. And you should also deduct depreciation. Then you will get what, sir? Profit before tax. From that, reduce the tax. You will get profit after tax. After that, adjustment. 5 adjustments. What are those? Add back. Tell me with signs. Add back depreciation. Add back. 1 minute. Why do you add back depreciation? Why do you add back depreciation? Because it is a non-cash. Cash did not go out, but you already deducted before. Hence, you add back. That is one adjustment. Then salvage value add. Why? Because salvage value means when you sell the asset, how much money you will get. So it's an outflow or an inflow. That means you will add. Sir, if the project life is 5 years, means salvage value you will get all the 5 years or once. Not to which year. If the last year, if project life is 5 years, means salvage value you will only get it in the 5th year. So it is an inflow only for the 5th year. Add salvage value at the end. Then opportunity cost. Either you will add or you will minus depending on the data. In this problem, I'll take up the data. Leave that part out. Then working capital. Sir, to start a project, initially you need fixed asset also. You need to invest in fixed asset. Only fixed asset, or you need to invest in your day-to-day business also. That day-to-day affairs only we call it as working capital. That means initially at year 0, you need to invest working capital. So working capital becomes inflow or outflow. At year 0, working capital becomes outflow. Now, when you do a project, would you like to recover only fixed asset cost or every cost? From doing a particular project, you want to recover all the cost with the profit. That means if you are invested in working capital, will you leave that money out? Or would you like to recover it? You like to recover it. When recovery can happen, whichever year. Recovery of working capital can happen, whichever year. But in all our problems, they will not give you when working capital is recovered. Hence, the normal assumption is, we assume that working capital is recovered at the end of the project. Assumption. Practically, recovery can happen any year. But since that information will not be given to us in the question, we will assume that recovery will happen at the end of the project. If project life is 10 years, means at year 0, working capital, you show it as a negative because it's an outflow. At the end of 10th project, at the end or for the 10th year, you will take working capital as an inflow because you will recover it. Yes. Okay. Then additional investment or your additional working capital, we will see that. These are the 5 adjustments, correct? And that you will get what, sir? You will get all the years cash flows. But all these cash flows will be on present value terms or future value terms? Future value. All these cash inflows will be on future value terms. Multiply discount factor and you will get the present value of cash inflow. Present value of cash inflows. How do you get NPV? Present value of cash inflow minus present value of cash outflow. That way you'll get it. That's all it is. So the why this question will become lengthy is cash flow data will not be given. You have to put one working note for cash flow data. Now imagine if they give the life is 10 years. Life is 10 years. That means you need to find cash flow for 10 years. Obviously problem will look big because you're not finding 1 year, you're finding 10 years. That's all it is. But conceptually this is all we'll have to do here. That's a format. That's the reason I've discussed the format now. We'll have to apply this. Can we do it? Okay, keep that in mind. Let's start. One hospital, Navajivini, is considering purchasing a machinery for medical projectional radiography, which is priced at 2 lakh. Now they want to buy a machinery, some blah 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 machinery. How much it will cost? 2 lakh. Sir, this 2 lakh rupees hospital will get, or they have to invest? Inflow or outflow? Outflow. Which year? Year 0. Year 1 ala. Year 0. Because to do the project, you have to invest now only. So at year 0, outflow is 2 lakh. This machinery will last for how many years? 8 years. Salvage value of 18,000 at the end of 8th year. 1 second, hang on. This particular 18,000 is salvage value. We should ignore salvage value or consider. Salvage value is an outflow or an inflow? Inflow. For every year or 8th year? For 8th year, the salvage value becomes your inflow. Okay, keep that in mind. Then annual operating cost is 22,500. Machinery means there will be some maintenance cost. And maintenance cost every year. They said annual. Every year maintenance cost is how much? 22,500. That means this is an income or expenses? Expense. It is expected to generate a revenue of 1,20,000 per year. So from this machinery, you will get how much revenue? 1,20,000. Now you get the idea? They have given you sales. We need a cash flow. How much is the sales every year? 1,20,000 per year for 8 years. Presently, check this line. Presently, the hospital is outsourcing this radiography work. Some X-ray work is, let's assume that it's an X-ray machine. Hospital is wanting to buy an X-ray machine. Currently, they don't have X-ray machine. Now means if you have to do any patient ka X-ray, what is this hospital doing? They are outsourcing this work to a neighboring test center. Next to the hospital, there is a testing center. They are giving this work to the testing center. And they are earning some check. And hospital is earning a commission of 36,000 per annum. Net of taxes. Okay, sir. So till now, we did not have X-ray machine. So whenever a patient came with an X-ray, what we used to do? We used to give this work to testing center. And we used to give this work to the testing center at free of cost or collect commission. Collect commission. How much commission we used to get? 36,000. Okay. All right. That means till now, this is an inflow for me. Till now, this is an inflow. It's a revenue for me. It's an income for me. Correct? Now, once I buy an X-ray machine, will I outsource this work or I will only do it? Till now, I did not have X-ray machinery, so I used to outsource this work. Now, once I buy the X-ray machinery, will I have to outsource this work? No. That means if I don't outsource this work to testing center, will they give me this commission or commission lost? Commission lost. This we call it as opportunity cost. Opportunity cost means sacrificing cost. Sacrificing cost. If you buy this machinery, what you have to sacrifice? One income you need to sacrifice. How much income, sir? 36,000. Okay, G. Correct. No. One income you are not getting. One income is getting reduced. One income, if it is reducing. If one income is reducing means it's as good as saying it's an outflow. Either you can say income reduced or cost increased. That means this opportunity cost in my calculation, I should show it as a negative number, positive number, what? Sir, if it's an inflow, I'll show it as a positive number. Outflow means negative. One income I am not getting. One income I am not getting. That means income is getting reduced. That means I have to show this as what? Outflow. I have to show this opportunity cost as an outflow. And this opportunity cost will come only 1 year or every year. This machinery will last for how many years? 8 years. That means for 8 years, will I get this commission income or I will lose? I mean, this will come only once or every year? Every year, I will treat this as an outflow for my calculation. Okay, Saru? Yes, everybody. So this is your opportunity cost. Done. So opportunity cost can be an inflow or it could be an outflow. In this, depending on the information. In this problem, it is an outflow. Why it is an outflow? Because one income which you are getting till now, are you getting or you will not get? Not get. That means one income is reducing means you can say income reduced or you can say cost increase. So if cost increase means you will show it as what? In this statement, all the outflows you show it as negative number. Inflow you will show it as positive number. Since income is reducing, you will show this as a negative number. Okay, people, this is your opportunity cost. Done. Can Can I move forward? All right. Net of tax, I'll say the importance of this little later. Analyze whether we should we purchase this machinery or not. We have to analyze using NPV method and profitability index method. Okay. Now, to analyze, we need cash flow. They have given cash flow or they have given sales. They have given sales and expense data. That means you have to use the sales and try to get cash flows. Can we arrive this? Same steps. Okay. So let's start. First, take the mental note of the number. How much is your sales value, sir? 1,20,000. How much is the operating cost of this machinery? 22,500. So let's take that first. I've already solved it. First step is to find out cash flow. First step is to find out cash flow. Now here, it's a format. You have two choices. One choice is, this machinery will last for how many years? 8 years. That means you can calculate from year 1, year 2, year 3, like this, year 8. All the 8 years ka cash flow you can calculate separately. One by every year ka you can calculate. Or you can just calculate annual net cash flow. What you'll do over here? Every year ka cash flow should we have to compute, or if you calculate for 1 year it is sufficient? 1 year it is sufficient. Why? Sir, sales every year, is it changing or same? Same sales you are getting every year. Same expense you are getting every year. Same opportunity also you are getting every year. I mean, so should we have to calculate, you have to put up 8 columns or 1 column is good enough? 1 column is good enough. Suppose they told first year sale is 1 lakh, second year sales is 2 lakh, third year sales is 3 lakh. That means can I do in one format or all the 8 years? All the 8 years. Next problem. Getting the difference? This is just a format change. Since here all the years ka data is same, I'll use the shortcut method. If you don't like this, you can calculate cash flow for all the 8 years. That choice is also available to you. Your format. Because this is a working note. The way you want to present, you can present. Can we do it? Okay. First is sales. How much is the sales in this question, sir? Quickly just see. How much is the sales? Sales is 1,20,000. We want sales or we want cash flow? From sales, we have to reduce all the expenses. How much is first expense? Operating cost 22,500. Let's also calculate one more here. Sir, depreciation there. Depreciation is also there. You bought the machinery for how much value? 2 lakh. Salvage value of the asset is how much? 18,000. Life of the machinery is how much? 8 years. That means what is the annual depreciation? Depreciation per annum is how much? Quickly tell. Quickly. Anyone has that number? 22,750. One sales we got, 2 expenses we got. Yes. So sales is how much? 120. Operating cost 22,500 and depreciation is 22,750. That's what I've taken here. Check. Sales is 1,20,000. Annual operating cost reduced 22,500. Depreciation reduced 22,750. Any other expense given or nothing? Nothing. That means from sales, if you reduce all the expense, what are you going to get? Earnings before tax. Then reduce the tax. Do you know the tax? Do you know the tax? So, yes, somewhere they must have given. Where is it? Here. Consider the tax rate at 30%. And one more thing, sir, they've only given the discount factor. When they have given the discount factor, you don't calculate. If they have given 3 decimal ka discount factor, take exactly the same. Otherwise, you lose marks. If they don't give, you have a choice. 3 or 4 decimal is fine. So anyway, now the tax rate is how much? 30%. So reduce 30% tax rate. From EBT, if you reduce 30% tax, you will get earnings after tax. Now stop. 5 adjustments. In fact, there are 6. Last one I'll tell you in the next problem if required. Okay. 5 adjustment, tell me, you know this. Add back depreciation. Then add back salvage value. Add back or add or minus operating cost. Working capital, add back. Then additional investment. Okay. One by one we'll take. Depreciation, is it there? Yes. How much have you reduced before? 22,750. 1 minute, be careful. Here we are trying to calculate what? Annual net cash flow. Annual net cash flow. Will depreciation come only once or every year? Every year. That means should we add back depreciation? Yes, added back. Okay, Saru. Now next, what you have to add? Next you have to add, no, we'll go in that order. We have to add salvage. There's no particular order. You can do whatever. I'm just taking this. That's all. Add salvage value. 1 second. I'm trying to find annual cash flows. Salvage value you will get every year or only once? Once. That means if I solve in this format, if I calculate cash flow in this format, can I consider salvage value here or separately later on? Separately. Because salvage value you will not get every year. You will only get once. Here we are trying to capture that information which comes every year for 8 years. Salvage value will not come for all the 8 years. So can I consider? We should take salvage value. But can I consider in this format or not possible? Not possible. Ignore salvage value. Later on I will consider. Next one. Working capital. In this problem, working capital is there? Not there. If it was there, can we consider in this format? Can we consider working capital in this format? No, because working capital initially you will invest once and at the end of the project you will recover once. Will it come every year or only once? Once at year 0 and another once at year 8. Will it come every year? No. I mean, salvage value working capital you have to consider separately if you are calculating cash flow in this format. Understood, everybody? Anyway, in this problem, working capital not there, so it is okay. Then additional investment. Sometimes in the problem they will say we need to buy a new machinery for 10 lakh rupees after 3 years. Initially you have to buy one machinery. After that you have to buy one more machinery for 10 lakh after 3 years. Such data is there over here? Not there. In this problem, not there. Next problem it will come. Okay, so leave that as well. Next is what, sir? Opportunity cost. In this problem, opportunity cost is there? Yes. What is that opportunity cost? Sir, currently we were earning how much commission from the testing center? 36,000. We were getting only once or every year? Every year. Now, once we buy this machinery, will we get this commission or we will lose this commission? One income we will lose. I mean, this is opportunity cost in the form of outflow. Outflow means we have to show it as positive number or negative number. Negative how much? 36,000. 36,000. Okay, sir. That means opportunity cost have reduced over here. Everyone cool? Salvage value, working capital, I cannot consider in this format because I am considering only those components which comes every year. Done? That is one. One more importance is in this problem, if you observe, they gave opportunity cost net of taxes. If you read that line, they gave opportunity cost is net of tax means after tax basis. After tax basis. So opportunity cost should always be considered on an after tax basis. Why? Sir, this cash flow is what, sir? This cash flow is before tax or after tax? After tax. So opportunity cost also should be considered on an after tax basis. So by chance, in this problem not there, suppose they tell you opportunity cost is 50,000 before tax. In this problem, no. By chance in your examination question, if they tell opportunity cost is 50,000, but it is on a before tax basis. Should we take opportunity cost on a before tax basis or after tax? Sir, if you want to get after tax basis in FM, one simple approach is what? Take the number and multiply by 1 minus tax rate. Let's say tax rate is 30%. What you will do? You will take 50,000 into 1 minus tax rate. Basically 50,000 into 0.7. You will automatically get how much? 35,000. Should we have to do this step in this problem or not required? Not required. Why? Because in this problem they told that opportunity cost is anyway net of taxes. Net of tax means after tax. That adjustment can be modified in your exam question if they require. Okay, sir. All right. By doing this, how much is your annual cash inflow? Every year, how much cash inflow you are expecting to get from that machinery? 39,075. You got your cash inflow. Sir, we want cash inflow or we want NPV? NPV. But to calculate NPV, we want cash inflow as well as cash outflow. That too on future value platform or present value. Now let's calculate the NPV in a normal fashion. Okay, sir. For NPV calculation, we start with what? Year. Year will start with year 0. At year 0, how much is your outflow? How much are you buying the machinery for? You're buying this machinery for 2 lakh rupees. So at year 0, your outflow is 2 lakh. And discount factor, they only given in the question. How much is the discount factor? I think we saw somewhere. The discount factor at 10% is, we have to calculate or they only given? Yeah. They only given. So they have given over here. Done? Okay. 1 minute, hang on. This is what, sir? This is PV. This is what? PV. They have given respective year ka discount factor. So this is PVIF. But we only worked out. Yes, in working note, our annual cash inflow is different every year or same every year? Sir, if it is same every year, should we have to calculate it 8 times or can we use PVAF? We can use PVAF. So add everything and find out PVAF for me. Add from here, from year 1 to year 8. Sir, don't calculate. If they have given this number means, don't do PVAF in your normal calculation. Don't do 1 divided by 1.1, press equals to button 8 times. No. If they have given means add this numbers only. Exactly same decimal should be taken. Otherwise marks will be deducted. If they don't give, you are free to calculate. If they give means exactly use this number and tell me how much is it. 5.334 is your PVAF. Easy people. Okay. All right. Let's start now. The cash flows. Year 0. At year 0, the discount factor is always 1. Okay. Next. Sir, every year, how much cash inflow are you getting? 39,015. You will get it for how many years? For the project life. What is the project life? 8 years. So, I mean, should I have to write 8 columns or can I write 1 to 8? 1 to 8. How much is the cash flow? 39,075. And will I use PVIF here or PVAF? Just now you calculated PVAF to be this much. Multiply these two, you'll get the present value of cash inflows, correct? But this inflows does not consider few components. What are those? Salvage value, working capital. Yes. Why? Because this cash flow is those cash flows which come every year. Salvage value comes every year. No. That means you have to consider salvage value separately in our format. Okay. Salvage value will come from year 1 to year 8 or 8th year. So that means 8th year, you'll write salvage value, and salvage value is given in the question to be how much? Salvage value is given in the question to be 18,000. That means now you will take PV what? PVAF or PVIF? This is your PVIF. They are only given in the question. So multiply these two, you will get the present value of salvage value. Done, Zaru? Then if it is working capital is there, means that also you need to bring it in here. Because working capital initially at year 0 it will be an outflow. But at the end of the project it will be an inflow. But in this problem, a working capital is there? No. For your reference, I have written 0 here. If it is not there, no need to bring it in. Okay, sir. So this is your present value of cash inflow. This is your present value of cash outflow. When you add all this, you will get NPV. How much is NPV? 16,832. All right. Now, they asked only NPV or also profitability index. How do you get profitability index? Present value of cash inflow divided by present value of cash outflow. Do that, you will get 1.084. What is the decision rule? If NPV is greater than or equal to 0, accept. If profitability index is greater than or equal to 1, accept. Here both are getting satisfied. In fact, profitability index is an extension of NPV. They will not give controversial results. Okay. That means here you will reject or accept. You will accept this particular project. That's all is this data all about. Okay, Saru. If I say it wants you to waste more time, then sales will not be same every year. It will go on changing. Or they will say depreciation is not under straight line method. Depreciation is under WDV. That means number of working notes will increase. Time will increase. Concepts remain the same. That's all it is. That is the next question. Can we review that? Okay. This one. I think time is there. Maybe I'll take up 2 more questions then. That will be fine with you. Another half an hour I may spend. Comfortable with you? Okay. X is planning to introduce a new product with a project life of 8 years. Initial equipment cost is 3.5 crore. Initially you have to buy the investment equipment, means this is what? Outflow. Outflow at which year? Year 0 ka outflow. Okay. Additional equipment. Check. Additional equipment costing 25 lakh. You will have to purchase at the end of 3rd year. Okay. That means this will come in year 0 or year 3. This is year 3 ka outflow. In fact, given here only. Yes. That's what we mean by additional investment. That's one of the adjustment we said. We said 5 adjustment we talked about. No, this is that additional investment I was talking about. All right. At the end of 8th year, the original equipment will not have any resale value, meaning salvage value of the original equipment is 0. But additional equipment can be sold for 2,50,000. It's a salvage value. Salvage value means you will get it every year or once. That too at the end of the project. When is project ending? I mean, this salvage value is what? This 2,50,000 is what? Year 8 ka inflow. A working capital. Stop. The moment they say working capital of 40 lakh, what should we take? At year 0, working capital will be an outflow. At the end of the project, working capital will be an inflow. So at year 0, outflow means you have to show this as a negative number. At year 8, it will be considered as a inflow, as a positive number. Done. Okay, next they have given, and they also told working capital of 40 lakh will be needed and it will be released at the end of 8th year. That means you will recover your working capital at the end of 8th year. Even if they don't say this, we will assume the same only. The project will be financed by sufficient amount of equity. To buy the machinery, we need fund, so we'll arrange it through equity. That's okay. Sales volume, sales value, sales volume for 8 years they've given, and if you check number of units sold every year, same or different. Now last problem ka format can we adopt, or all the 8 years cash flow separately? Since cash sales is changing every year, all the cash flow every year will change. So you can't calculate annual cash flows. You'll have to calculate 8 years cash flows separately. So time, extra 10 minutes gone there. That's all it is. Okay, sir. Fine. Selling price is 240. Awesome. One quick fix is when they give you big value, okay, try to maybe convert it into lakhs or thousands and answer it, so that you can save a little time. Space especially. More than the time, it's a space. Because you have to fit how many columns? 8 columns along with calculations. So taking full number, because it is 72,000 units and selling price is 240. So if you do 72,000 into 240, the number will run into crores. So instead of that, we can take the value in lakhs. 72,000 is nothing but 0.72 lakhs. Yes, no. 1,08,000, you can write it as 1.08. This way, number will get shorter and you'll be able to fit the numbers into your pages easily. That is one. Otherwise, you can take full number, your choice. Okay, variable expense is 60% of sales. Sales given, variable cost given. Fixed, they clearly, watch. Fixed cash operating cost. Sir, depreciation is a cash expense or non-cash? Depreciation is fixed expenditure. If it's straight line method, depreciation every year will be same. But is depreciation included? They are saying fixed cash cost is 36 lakh. Is depreciation included in this or not included? Because they specifically told it as a cash. That means the depreciation is excluded. Should we consider depreciation initially to find profit before tax? Yes. Okay, that is not included in 36 lakh. We have to do a separate calculation. Now check this. Loss of any year will be set off from profits of the subsequent 2 years. This is income tax ka set off provision has been introduced here. If any year, if you get a loss, you can carry this loss forward for how many years as per the question? 2 years. Now don't jadify your income tax knowledge and say Income Tax Act allows 8 years. Question is wrong. I will take 8 years. So if you know, keep it to yourself. Okay. If question says 2 years means 2 years. Do not question the question. Okay. So 2 years you can carry forward and set off the loss. Company is subject to how much tax rate? 30%. It considers how much to be the appropriate after tax cost of capital. 12%. Cost of capital is nothing but your KO, which is nothing but your discount factor. Company follows straight line method of depreciation. Great. Calculate the NPV of the project and give the advice. Advice we know, no? NPV is greater than or equal to 0 means accept. Otherwise, reject. Good thing they only given the PVIF. They've given PVIF. So we need to analyze. Tax carry forward of loss is one extra adjustment here. Can we review this data? Okay, first working note. You guide me quickly. First working note. Cash inflow. Like last format or every year separately? Why can't we do it every year same? Because is the sales same every year or changing? Changing. That means the first thing is you'll have to put up a working note for cash inflows. There's no order. You can follow it whatever order. Okay. If you have started already, absolutely no issues. Sometimes what happens, we will start with present value. This working note we will put. Then we'll feel that some data is missing. It's okay. If you have started with this data means one page you leave for that working note. Then you start the next working note in next page. It's absolutely okay. Absolutely fine. All right. First, we'll find out the present value of cash flows. How many years? 8 years. So have they given or we need to calculate? And we have to start with what? Sales. How much is the sales for first year? 72,000 units. 72,000. All the numbers I'm presenting in lakhs. 72,000 becomes 0.72. And selling price per unit they've given to be 240. So respective years ka number of units they have given and selling price they have given. So multiply, you will get the sale value. Easy, people. I'll not go into all the calculations. I'll just quickly tell you the overview of the approach. Yes, no? From sales, you have to reduce all the expense. They told you variable cost is 60% of sales. So reduce variable cost as given in the question. It is 60% of sales. So 172 lakh 80,000 ka 60% if you do, you will get 103.68. Similarly, 259.2 ka 60% if you do, you'll get 155.52. Like that, go on for doing for all the years. Till you're fine now. Okay. Now, next they give fixed cash operating cost. If you read the data, how much was that cash operating cost? I think 36 lakh or something, no? Fixed cash operating cost is how much? 36 lakh. So reduce 36 lakh. Okay, but keep in mind that this is a fixed cash operating cost. So this will include depreciation or exclude? Exclude. So reduce 36 lakh cash operating cost every year. Then it is your depreciation. Now I cannot proceed. Why? Because we have one asset or two assets. Two assets. First asset you purchased at year 0. Second asset you purchased at the end of third year. That means depreciation will be same after third year or it will change? It will change. That means I need to put up a working note for depreciation. This is what I told. If you started with this working note, don't freak out. Leave one page. Go back to the next working note. Okay, if you are able to visualize before only, then present it in that particular order. Otherwise, it's absolutely okay. Now let's calculate depreciation. I put working note number 2 for that. What is working note number 1? We'll see it later. Good so far? Okay, how do you calculate depreciation, sir? Take your calculator. Maybe we'll do all this calculation. How much did you buy the asset initially for? 3.5 crore. Okay. Sir, this is your original equipment. Original equipment has salvage value or no salvage value? And life is how many years? 8 years. Since all the numbers are in lakhs, maybe instead of 3.5 crore, take it as 350 lakhs. So you'll directly get it in lakhs on. So 350 divided by 8 is how much? Quickly. 43.75 lakh. This is the depreciation from year 1 to year 3. Year 1 to year 3. Why? Because at the end of third year, you purchased another fixed cost for how much? 25 lakh. Sir, you purchased additional asset at the end of third year. That means that additional asset, will it have any third year ka depreciation or it starts from fourth year? Starts from fourth year. That means what is additional depreciation ka cost? 25 lakh. Will it have any salvage value? Yes, it can be sold for 2.5 lakh as given in the question. Divided by life, don't write 8. Sir, you bought this additional equipment at the end of third year. Project will get over at the end of 8th year. 3 years is already passed. How many years remaining? 5. That means you will take it as 5. How much is this? 4.5. So that means for first 3 years, depreciation will be 43.75. For fourth year onwards, depreciation will be 43.75 plus 4.5. That means what will be debris? 48.25. This will be the depreciation. 25, right? This will be the debris from fourth year onwards. That's what I've done in the calculation here. Check. From year 1 to year 3, okay, the depreciation is 43.75. From year 4 onwards, on original equipment, you will get 43.75. On additional equipment, you will get an extra debris of 4.5. So from fourth year onwards, the depreciation will become 48.25. Okay, sir. Now you have to update. From year 1 to year 3, how much is debris? 43.75. Reduce that depreciation for your cash flow working. But from fourth year onwards, it will become 48.25 till 8th year. Done. All the expenses covered. From sales, if you reduce all the expense, what are you going to get? Earnings before tax. Check, 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 check everyone. First year earnings before tax, you got profit or you got loss? You got loss. For all the other years, you have got profit, but first year you have got a loss. There's the tax ka concept brought in here. Now, Income Tax Act allows that loss can be carried forward for 8 years. But we are not solving income tax question. We are solving FM. And in our question, they have clearly mentioned that you can carry forward the loss only for 2 years. Now, okay. Now, here we have a loss. Sir, in the year you get a loss, will you pay any tax or no tax? No tax. That means that year may tax will be 0. Next year, the profit is 23.93 and tax rate is 30%. Will you pay tax at the rate of 23.93 into 30%? No. Out of this profit, this much loss, first you will set off. So from 23.93, 10.63 ka loss you adjust. How much remains? From 23.93, if you reduce 10.63, how much you will get? 13 point something. On that only you will pay 30% tax. So multiply 30%, you must be getting 3.99. That is the tax for the second year onwards. That means any loss is there or it got fully adjusted. The next year, you can carry this loss forward for 2 more years, but it got adjusted in next year only. That means any remaining loss is there or fully done? Fully done. Suppose there was a shortage. Suppose this year profit was only 5 lakh means. You can adjust only 5 lakh loss. Though the loss is 10.63, you can adjust only 5 lakh. Remaining loss you will adjust it in the next year profit. Even next year also we don't have profit means that loss will get lapsed. Because question says you can carry it only for 2 years. But in this way, we have that locha, we have that problem or no problem? No problem. So loss for first year is, tax for the first year is 0. Next year, after adjusting the loss, the tax that you pay to the government is 3.99. From year 3 onwards, any drama or no drama? 169.85 into 30%. It's this number. Go on, multiplying the profit with the tax rate, you will get profit. Okay, G. From EBT, if you reduce tax, what you will get? Earnings after tax. Now, 5 adjustments. Okay. Now in this format, should I ignore any adjustment or I can consider everything? I can consider everything because I am preparing only what? Annual cash inflow or every year ka cash inflow? Every. That means every adjustment in this format you can consider. Even last problem you can solve in this format. Absolutely okay. It will take 1 or 2 minutes extra, but if that is your preference, you can do it like that. That's okay. Now 5 adjustments. Tell me once again what are those? Add back depreciation. Depreciation here you have. Same thing I added back here. 1 adjustment done. Next, salvage value. I think additional equipment had a salvage value of 2.5. When you will get? Every year or 8th year? Outflow or inflow? Inflow. For 8th year salvage value, you have to take it as inflow. 2.5 lakh, but all the numbers I'm presenting in lakhs, so 2.5. 2 over. Third one, opportunity cost. There or not there? Not there. Ignore. Fourth one, working capital. There or not there? Very much there. How much is working capital? We read there somewhere. Working capital is 40 lakhs. Stop. Working capital means at year 0, it will be an outflow. At the end of the project, which is here is 8th year, it will be an inflow. Now we are working annual cash inflow ka working note. That means at the end of 8th year, I should consider how much is working capital. 40 lakhs as an outflow or inflow? Inflow. So working capital at the end of the project, I'll take 40 lakhs. So what about outflow? That's what I put working note number 1 for. There I will consider. Leave that. I'll come to that. Okay, Saru. This is done. So salvage value over, depreciation over, salvage value over, opportunity cost not there, working capital not there, then additional investment. Additional investment. Here, is there any additional investment? Yes. At the 3rd year ending, you bought additional equipment which costed how much, sir? 25 lakh. This 25 lakh you invested at year 0 or year 3? Year 3. That means come to year 3. This is your year 3. Additional investment how much? 25 lakh. Investment means what, sir? Inflow or outflow? Outflow. So minus 25 lakh. All the 5 adjustments got captured here. So that way you will get. All these are what, sir? Cash flow what? This cash flow you will get at the end of 1st year. This one you will get at the end of 2nd year. That means all these are present value platform or future value? Future value. We want what? For NPV calculation, we want future value or present value. All these are cash inflows. Net cash inflows. So multiply discount factor here only. It will be sorted. Okay. Instead of putting a separate table, you can multiply discount factor here only. Discount factor we have to find or they only given in the question. They only given in the question. Copy the discount factor they have given in the question. This is your future value. This is your discount factor. Multiply, you will get the present value. That's it. This is what? Present value of cash inflow. Adding all the present value of cash inflow, how much are you going to get? 551.127. We want this or we want NPV? For NPV, we want present value of cash inflow minus present value of cash outflow. But hang on. Are we investing only in asset or are we also investing in working capital? Okay. That's the reason I prepared a separate working note for this. At year 0 outflow, how much original equipment did you purchase? 3.5 crore, which is 350 lakh. Plus there was also working capital for 40 lakh. So at year 0 outflows, how much? 390. Okay. So this we have to find out present value or it's already there on present value platform. Year 0 means now. Now how much did you invest? 390 lakh. I mean this is already on there on what platform? Present value platform. So present value of cash outflow is 390. Present value of cash inflow ka total we got it to be 551.127. How do you get NPV? So these two ka minus if you do, you will directly get the NPV. That's all. I've just changed the presentation for convenience. That's all. Okay, sir. 1 minute. I'll come to that. So far, okay. So how much is NPV over here? 161.12. So NPV is positive means reject or accept. Accept the decision. Okay. Loss adjustment you didn't understand it. Hey, why da? Loss is very simple da. In the year you get loss, you make the tax to be 0 because the year you get loss, will you pay tax or you'll not pay tax? You'll not pay tax. So that year you'll make law. That year you'll write it as 0. Next year, though the profit is 23.93, you will not pay tax on 23.93. Income Tax Act gives you loss ka benefit. What they say is, if any in any previous year, if you have suffered any loss, you can adjust the loss from profit. So from 23.93, you can from 23.93 reduce 10.63. How much you going to get? 13.3. Maybe I'll write it. 13.3. So next year you will pay tax on 13.3 ka 30%. So 13.3 ka 30% if you calculate, you will get 3.9. That's how you calculate. That's all. Okay, na ji? That's it. Adjust the loss and then calculate the tax. Sir, why are we not reducing working capital in cash flow statement like additional investment? No. So they're saying, why are you not reducing working capital here? In the statement, I am getting a question, why are you not reducing working capital? You have to look at the heading, Akshaya. I'm trying to find present value of cash inflow. And inflow starts from year 1. Year 1. Right? Working capital, when will you invest? At year 1 or year 0? Year 0. Is my table starting at year 0 or year 1? Year 1. That's the reason working capital investment I can't capture here. Because my table is only starting at year 0. If you want to include working capital here, then you have to start your working from year 0. If you start your table from year 0, then you can consider those adjustments. It's all format. Based on the format, you can decide. Okay, like that. Okay, this is also done. One more pointer about taxation, I'll tell you. What is, sir, couple of ways this we just now saw set off and carry forward of loss adjustment. Two ways that adjustment generally comes in examination. One is the one we just now saw. What is that? In whatever year you make a loss, you can carry this loss forward for few years and set it off. In this problem, you can carry it forward for 2 years. Maybe in your next examination question, they may say you can carry it forward for 5 years, whatever, that option. In some problems, they will not give any set of information at all. Year you will get a loss. First year you have got a loss. How much loss have you got? Listen to this carefully. I don't have any question on this. I'm only discussing at concept level. Fine. Regular class we have done question. Here I'll not be doing it. Okay, it's the same concept. That's the reason. First year you got how much loss? 10.63. Okay. Have you got loss in the first year? Yes. But question will not tell what. Here in this problem, they told what loss can be carried forward for 2 years. That adjustment will not be there. Question will mention nothing about set off. In that case, or in such problems, what you will do is, that's what I've written here. So in this year, how much loss have you suffered? 10.63. Stop. Due to loss, your future tax will reduce because you will get tax benefit. On profit, you have to pay tax to the government. On profit, you have to pay tax to the government. On loss, you will get tax benefit. You will get tax benefit. If they don't give any set of information, in that case, what you do is, how much is the loss in the first year? 10.63. How much is the tax rate? 30%. Calculate 10.63 ka 30%. 10.63 ka 30% you do. How much is that? Quickly, number you punch in a calculator. 10.63 into 30% if you do, you'll get 3.189. 3.189. Take that 3.19 on this loss, you will get tax benefit. How much tax benefit you will get? 3.189. Take that benefit in year 1 itself. Meaning, when you are doing this calculation, you will take this, like here you will write earnings before tax is. Earnings before tax is how much? 10.63. Then you will write tax. Sir, if you're paying the tax, it becomes your outflow. Here, are you paying the tax or you're getting the benefit? If you're getting the benefit, means tax you have to show it as a negative number or positive number. Positive number. Make this as a positive number. That means net what is your earnings after tax? These two you net off. When you adjust, you will get 7.441. This is what you'll have to do. Understood both the adjustments? Once more or clear? Paka? When will you do this adjustment? Tell me once again. Or I'll tell you the rationale behind this. What is the logic behind this is? Sir, is it necessary a company should have only one business or they can have multiple business? Multiple business. Income Tax Act allows from one business if you make a loss, you can set it off with other business income. That is the assumption here. From this business, how much loss you suffered? 10.63. Possible that you can have another business. From that you can generate income. Now this loss you can set off from other business income. That is the reason you can take the benefit in the first year itself. That's all it is. Instead of carrying it forward, are you carrying it forward here or taking the benefit current year only? Taking the benefit current year. Because you are adjusting this with other business income. That is the assumption ICI books makes for this particular tax adjustment. Hopefully this is okay for everyone. Quickly summarize for me. What is it? Two adjustment relating to tax? If they say tax can be carried forward for 2 years. In the year you make loss, you'll write the tax to be 0. In the future year, you first set off the loss and calculate the tax. That is one adjustment. If they don't give any set off information, what you will do? On losses, you will get the tax benefit. Will you take this benefit in future or that year itself? First year, if you suffer a loss, means first year only you take the benefit. That's all it is. Check how they have framed the adjustment and accordingly do this particular tax adjustment. One more way this can be asked. Okay, this is done. No. Next. What is next? I will tell you. 1 second. One more question I will do and then I think this topic should be good enough. Next one extra concept is there that I will explain it through one question itself. Okay. Come to question number 22. Again, study material question. Good question. Has come a few times in the examination. Okay. HMR Limited is considering replacing a machinery operating old machinery with fully automatic new machinery. So currently we have an old machinery that we are planning to replace with the new machinery. So this is your replacement decisions. If you are replacing any assets, we are calling it as replacement decision. So keep this in mind. Whenever you are replacing an asset, always you will have to find out incremental NPV. You have to always solve this question under incremental approach. Okay. Incremental approach. Incremental means extra. What is this approach is? Sir, currently you have old asset. Currently you have old machinery. You are replacing it with a new machinery. Normally, what do we do, sir? We find the NPV of the old. We find NPV of the new. If new is giving more NPV means accept it. Correct? Now, this only we call it as, suppose NPV of the old asset was, old machinery is 1 lakh. NPV of the new machinery is 1 lakh 50,000. Compared to the old, new is giving how much extra NPV? Compared to the old, the new asset is giving an extra NPV of 50,000. This we call it as incremental NPV. So always replacement decision ka problems you have to solve under incremental NPV approach. Okay, sir? Okay, 1 second. Sir, to find out NPV, what do we need? We need a cash inflow and cash outflow. Are we doing in a normal approach or incremental approach? Incremental. That means will you take cash inflow or will you take incremental cash inflows? Every data now you have to take incremental. Like here, old machinery ka sales is 1 lakh. Using old machinery, you used to get a sales of 1 lakh. New machinery gives you a sales of 3 lakh. That means will you consider 1 lakh or 3 lakh or incremental? Incremental. How much is the incremental sales? 2 lakh. You will take this particular, you have to take incremental income. For your incremental, for your NPV calculation, what and all you need? Cash flows you need. Cash flows in this problem they would have given, or we have to estimate. And they would have given the date of what? Sales. Will we take sales of old machinery, new machinery separately, or will we take incremental sales? We have to take incremental sales. From incremental sales, you reduce incremental expenses. You will get what? Incremental earnings before tax. Reduce tax. You will get incremental earnings after tax. Then add back incremental depreciation, incremental salvage value, incremental working capital, all that. Basically, extra component we need to take and find out the extra NPV. If that extra NPV is positive, means accept the new project. Otherwise, reject. That's how to do it. Not that if you do it separately, it is wrong, but always these problems I say presents under incremental approach. Okay, don't confuse the invigilator. Your final answer will match. But invigilator, he's a CA, but he is not your FM teacher. So he will only look at suggested answer and your working note. If you do old ka NPV separately fully, new ka NPV separately fully, but suggested answer has a incremental approach, then all your working note and suggested answer ka working note will not match. Only final answer will match. So invigilator will think somehow this guy has done some jugaad and got final answer correct. So take 1 mark. Take only 1 mark. But the reality is you should get full marks. But since you followed a different approach which is not matching with ICA suggested answer, CA for you in this attempt is come again for exam. Okay, so let's not do that happen. So always replacement decision for examination, you work under incremental approach. How that works, we will learn with the help of this particular question. Okay, G? That is the first thing. Okay, one more concept is there which we will learn through this question. Okay, now check this. The old machinery, read the data carefully. Though it's a small question data-wise, concepts are there, quite a few concepts. So you need to keep a track of them. Old machinery has been fully depreciated for tax purpose. That means as per as tax is concerned, will you get any extra depreciation on old asset or it's fully depreciated? Fully depreciated. Okay. But the book value is 2,40,000. Sir, if it is fully depreciated means value should be 0. But hang on, you know this. Sir, depreciation as per accounts and depreciation as per tax will not match. Because depreciation is as per accounts is charged as per accounting standard 10, which talks about property, plant and equipment or fixed asset. So in accounts we charge depreciation as per accounting standard 10. But for Income Tax Act of 1961, if you refer, for each asset, Income Tax Act gives you the rate of depreciation. So accounts ka depre and tax ka depreciation will not match. Okay. So as per as tax is concerned, you are fully depreciated. So the book value as per tax is 0. But accounts you are following different depreciation amount. Hence the book value is there how much? 2,40,000. This 2,40,000 is value as per accounts. As per tax, the carrying amount of the asset is 0. Okay. Now, understood this? Now stop. Should we consider depreciation for our cash flow calculation? We are not worried about accounts. We are not worried about tax. We are worried about cash flow. We need cash flow for our decision making. Will we consider depreciation for cash flow calculation? Yes. Initially, what do? Reduce it. Then after tax, we will add back. Why do we do this? Initially, we reduce because on depreciation, we get tax benefit. That means we should consider accounts ka depreciation or tax ka depreciation for these. Since we consider depreciation because we get tax benefit. That means in FM, what we are concerned with is the tax benefit on depreciation. So we are not worried about accounts ka depreciation. We want depreciation as per tax record. And as per tax record, will you get any more depreciation or old asset, or it's fully depreciated? Fully depreciated. That's what I've given over here. We want depreciation as per tax and not accounts. And as on depreciation, we only get the tax benefit. On old asset, can you charge any extra depreciation or as per tax, or nothing allowed? Nothing allowed because it has got fully depreciated. That is one point. Okay, next one. The machinery, the old machinery basically, it has begun causing some problems with breakdowns and it cannot fetch more than 30,000 if sold in the market currently. That old machinery is causing some problems. Currently, if you sell that old machinery, how much will you get? 30,000. Okay. It'll have no realizable value after 10 years. If you kind of repair this machinery and use it for 10 more years, then what will be its salvage value? 0. Now, if you sell, you'll get how much? 30. If you continue to use it for 10 more years, means you will get 0 as salvage value on old machinery. A company has offered 1 lakh rupees for the old machinery as a trade-in for the new machinery, which has a price of 4,50,000 before allowance of trade-in. Now, sir, we have approached a vendor to buy a new asset, new machinery. New machinery ka how much is he quoting? 4.5 lakh. So we are doing a barter system. What is that barter system? If you have an old asset, when you want to buy a new asset, what will you do? Old exchange offer you will do. Old you will give and take the new one. For the old, though the market price is only 30, how much is vendor willing to give? 1 lakh. He's saying, I will consider that old asset ka value to be 1 lakh. What is new asset ka value? 450. I mean, should we have to pay 4,50,000 cash to the new vendor, or 3.5 is good enough? Yeah. Though the value of new machinery is 4,50,000, old asset can fetch you how much? 1 lakh rupees as per the vendor. That means you will give only how much, sir? 3,50,000. That is your extra cost. Understood? Okay. Expected life of the new machinery is 10 years and salvage value is 35,000. Sir. Old asset ka salvage value how much? Now we have to think. If you continue to use, now you have an option. You have an option to continue the old asset for 10 more years or replace it with the new asset. If you continue to use the asset for 10 more years, salvage value is 0. And if you buy a new machinery, salvage value is 35,000. That means we want what's a salvage value or incremental salvage value? Incremental. Old gives a salvage value of 0 after 10 years. New gives a salvage value after 10 years, 35. So how much is incremental salvage value? 35,000. You have to take always every number on an incremental approach. Okay, sir? Alright. Further, company is following straight line method of depreciation. But for tax purpose, WDV method is followed. Go in the WDV method means every year depreciation same or it will change. That means can we follow our old format, annual cash flow format, can we follow, or all the 10 years? The 10 years, because depreciation data will go on changing. Problem became lengthy. That's what it is. Got it? Okay, this is one. Alright, 1 second. Sir, for accounts we have followed straight line method, no sir. 1 second. We want depreciation as per accounts or tax? Tax. And as per tax record, which method is allowed? Written down value method. So that we will have to use for our decision making. And what is the depreciation rate as per WDV method? 7.5%. Considering that this machinery is the only one in the block of asset. So this is one concept is there. I'll do a thing. I'll not explain this now. It may become too much for few people. I'll leave this for the time being. Okay. Once I finish this problem, then I'll come back to this concept and explain you what to do when this particular adjustment comes. Okay. That's one extra fitting you'll have to do. We'll take it at the end. So far, okay. All right. Below are the expected sales and cost from both old as well as new. Old ka sale, they've given cash flow or they've started from sales. But one good thing is they only worked out everything. See, from sales, they've reduced material cost. If you want, you can also calculate and check. From sales, they've reduced material cost, they've reduced labor cost, they've reduced variable overhead, fixed overhead, they've reduced depreciation, and they've got profit before tax to be 324 and 387. This they have only worked out. Yes, people. But I have only one problem in their working. Rest and all is good for me. Only one I have issues. What is that? Depreciation. Sir, all this data is as per accounts. Correct? No. How to confirm? Sir, depreciation is how much? 20,000. And moreover, these are all cost on an annual basis. Every year, what is the benefit cost they have given? Sir, every year depreciation they are telling it to be how much? 24,000. Which method gives you same depreciation every year? Straight line method. For tax purpose, are you following straight line or WDV? That means, can we consider this depreciation or not acceptable? Sir, this is depreciation as per accounts. This is depreciation as per accounts. We want depreciation as per tax. Every number is okay, but only depreciation is a problem. So what I'll do? Should you have to restart from the beginning? Anyway, we need what, sir? Cash flow. If you want, you can work from the beginning. But anyway, they worked out till what? Profit before tax. Sir, they have reduced depreciation also and they have got profit before tax. Can we reduce this depreciation? Is this allowed? No. We need to take depreciation as per WD. So hence add back this depreciation. That's a first working note. Add back this depreciation. When you add back, what will you get? What is profit before depreciation? Profit before depreciation. Quickly tell me how much is that? 324,750 and 24,000 you add. Quickly do. 3 lakh? 3,48,750. Okay, here 387 and this one you do, how much you going to get? 4,20,000. 4,28,750. Okay, 3,48,750. I will start with this number instead of working from the beginning. Anyway, they worked out till here, no? See, all this number may, is there any issue or no issue? No issue. Only issue was with around the depreciation. Okay, G. No. Will I find old machinery ka NPV and new machinery ka NPV separately, or I will take incremental? Incremental. That means I want this number or I want incremental. I want incremental profit before depreciation. Add these two ka difference, you find. How much is that difference? 80,000 dot. Correct, no? So compared to the old machinery, new machinery is giving you incremental profit before depreciation. How much? 80,000. This is the first working note I've done here. Check. Are you comfortable with that? Where it went? Here. Profit as given in the question I've taken, added back depreciation, you get profit before depreciation. Should we take profit before depreciation or incremental profit? Incremental profit is difference of these two, which is how much, sir? 80,000. This is what we need. Because we are solving under total NPV approach or incremental NPV. So every number you have to take on an incremental basis. Okay, Saru? Yes, people? Unfortunately, no. I don't know why I say I did not like you. Sir, every cash flow, every profit or every income and expense is same every year. Only one culprit. What is that one culprit? Depreciation. If depreciation was also same every year, no, such a smile. But unfortunately, depreciation under WD. Because of that depreciation, I have to put cash flow for all the 10 years. Okay. But I have to, before I put this working note, I need to calculate depreciation. And I have to calculate depreciation as per WDV method. Start. And moreover, I want depreciation or I want incremental depreciation. Incremental depreciation. Okay. Now, 1 minute, everybody. There's a tax concept. I've explained this to you. Hopefully, you remember this. But anyway, once again, I'll try to explain. Okay. Sir, as per tax record, no, whenever you follow WDV method, okay, income tax depreciation works on a block basis. Income tax depreciation always works on a block basis. Block means a group of assets which has similar characteristics. Like if you have 5 machineries, they belong to one block. If you have 3 buildings, all the 3 buildings put together will become one block. If you have many assets which are similar, you will all add them up and they become one block. So Income Tax Act of 1961, this is not FM concept, not accounts concept. Income Tax Act says that as long as the block is there, you go on charging depreciation. If the block comes to an end, means depreciation also will stop. When will block come to an end? When you sell the asset. Okay, people. Now, let's take this now. First, let's calculate the depreciation base. How it works. Sir, currently you have which asset? Existing machinery. Sir, what is the... Now, 1 minute. Again, recap. for your FM calculations, we need accounts depreciation or tax depreciation? Tax ka depreciation. Old machinery, does it have any WDV as per tax, or it has got fully depreciated? Old machinery as per the question has got fully depreciated. That means WDV of the existing machinery as per tax record is 0. As per accounts, value is there. That is irrelevant for me. We want value as per the tax record. The WDV of the old machinery as per tax record is 0. That means, will you get any depreciation on old asset or no depreciation? No depreciation. So depreciation based on existing machinery, 0. Correct? Okay. Now on new machinery, you purchase new machinery. Sir, how much are you purchasing the new machinery for? 4,50,000. Now, how this calculation, block ka calculation works is, it's very simple. Let us say, or it's like this. Let us say, okay, we have let's take a small number. Let's say we have old machinery ka W. I've assumed a different number just for understanding purpose. Let's say old machinery ka WDV in tax record is how much? 20,000. Assumption. This is just an assumption. How you calculate depreciation basis? First, you take WDV. Is old machinery there or you sold? Sold. How much did that vendor take the old asset for? 1 lakh. So reduce that. If you sell any asset in the block, means the sale value first you need to reduce. Take the WDV, take the opening WDV and reduce the sale value. Right? Now, do we have the same asset in the block or new asset got added? Instead of old asset, you added the new asset. So add purchase cost of the new asset. What is the purchase cost of the new asset? 4,50,000. That means the block ka value will become 3,70,000. Now you will calculate depreciation on 370. This is how tax ka depreciation works. How is it again? Tell me, what is it? First, you will take opening, you will take the WDV. Before sale, what is the WDV? Take that. When you sell the asset, asset in the block is same or it is getting reduced? Reduced. So take the WDV of the block before sale. From that, you reduce the sale value. You just sold or you added asset also. When you added block asset value will be same or it will increase? It will increase. So add the purchase cost of the asset. In simply formula, if you want, means you take WDV before sale, deduct the sale value, add the purchase cost. Okay, sir. That is what we have to do it over here. Now check, sir. What is the, coming back to this question, what is the WDV of the existing machinery as per tax record? 0. But did you sell it for some value? Yeah. Oh, vendor is ready to take this old asset for how much value? 1 lakh. So reduce that. Plus what? Did you only sell or did you purchase new asset also? So purchase new asset also for how much? 4,50,000. That means the formula will be 0 minus 1 lakh plus 4,50,000. If you do this, how much you're going to get? 3,50,000. That means the value of the block will be how much now? 3,50,000. You will be able to calculate depreciation on 3,50,000. Okay, sir. This is the depreciation on new machinery. Correct? But are we doing under old and new separately or incremental approach? Incremental. What is the depreciation base for the old asset? 0. What is the depreciation base for the new asset? 350. That means compared to the old, your new asset ka incremental depreciation base is how much? 350. 0 minus 350 or 350 minus 0, which is 3,50,000. Now you all have to calculate, go on calculating this. On this, if you calculate, since this is incremental depreciation base, on this, if you calculate depreciation, will you get depreciation for the new machinery or extra depreciation? Since this is an incremental number, any depreciation on this, if you calculate, it will be incremental depreciation. Everybody cool? So let's calculate it. But you have to calculate for all the years. And years is how many years? 10 years. A very simple WDV calculation. What is the base? Incremental depreciation base is how much, sir? 3,50,000. So that becomes your opening balance. As per Income Tax Act, you'll charge depreciation on this asset at what value? As given in the question, 7.5%. So 3,50,000 ka 7.5% you calculate. How much is that? 26,250. So it was 350. You depreciated by 26,250 means closing balance will become, these two minus will become 323,750. First year ka closing will become second year ka opening. Now on this you can calculate 7.5% depre. It will become 24,281. Like that you go on calculating the balance. Okay, at the end of 10th year, the closing balance of the asset will become 1,60,504. Okay, or there is one shortcut method also, how to calculate. You don't have to calculate this, you can calculate depreciation directly. You want me to tell you that? Okay, sir, how much is depreciation rate? Sir, originally what was the value of the asset? Originally the value, 7.5% is always expressed on 100, correct? No, percentage is always expressed on 100. Sir, how much is the first year ka depreciation rate? 7.5%. So from 100%, you reduce 7.5%. How much are you getting? 92.5%. Express this in full number. 92.5 divided by 100 if you do, what are you going to get? 0.925. Okay. how to calculate depreciation is, first year you do it normally. 3,50,000 ka 26,250 you do. How much is that? Or 3,50,000 ka 7.5%. How much is that? 26,250. For next year, no sir. Simply you take 26,250 and multiply 0.925. Calculate 26,250 ka 0.925 you do. What are you getting? 24,280. That is your next year depreciation. Without putting the table, you can calculate directly. And next year, if you want, means take 24,281 and again multiply 0.925. Go on multiplying 0.925. Do it. 24,281 ka 0.925 you do again. Into 0.925 you will do. You will get third year ka depreciation, which is 22,460. Again multiply for this number 0.925 you multiply, you will get 20,776. So if you don't want to put this working note, you can calculate directly like that. That's a shortcut method. Understood everybody? Pakka? Pakka, 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 pakka. Now, why did I reduce 7.5%? Sir, you are calculating depreciation under which method? WDV method. On WDV method, first year ka closing balance becomes next year ka opening balance. So, first year ka opening balance was 100%. First year, if you depreciated 7.5% means closing balance will become how much? 92.5. That's the reason we go on multiplying 0.925. Suppose if depreciation rate was 15%, you tell me what you will do. If the depreciation rate is 15%, what you will do? First, you will take 100% ka minus 15% you do. You will get 85%. 85% or 0.85. Now you will go on first year ka depreciation, you calculate normally. And then onwards, what you will do? Go on multiplying 0.85. You will go on getting respective years ka depreciation. This is a shortcut method. Either you can follow this method or your shortcut, whichever works out best for you. Done, Saru? So this is the depreciation for every year from year 1 to year 10. Same are changing every year. Changing every year. That means, can I put annual cash inflows or I have to put cash flows separately? Separately. But what is my incremental earnings before depreciation? Only one number is changing every year, which is what? Depreciation. But all other income, all other expense are same. What is my earnings before depreciation? 80,000. Now let's do the calculation. Okay, now it becomes a simple calculation. What is the incremental earnings before depreciation as per our working note, which we did? 80,000. That we already did. Correct? This is earnings before depreciation. Reduce the incremental depreciation. How much is the incremental depreciation we got for respective years? Here, 26,250. This data copy. 26,250, 24,281, etc., etc. Go on copying here. Okay, Saru? Wait or got it? Just showing you the calculation. Okay. So this is your earnings, incremental earnings before depreciation. From this, if you reduce depreciation, what are you going to get? Earnings before tax. Will you get earnings before tax or incremental earnings before tax? Now onwards, normal steps. From this, you reduce what, sir? Tax. You will get what? Earnings after tax. Now 5 adjustments. But all the adjustments, you will do it on total basis or incremental basis? Incremental basis. Tell me the 5 adjustment. Add back incremental, not Zelag. Add back incremental depreciation. We have to calculate or already done? Already done. Add back all this. That is done. Next one. Salvage value, no? Incremental salvage value. No? Incremental salvage value. If you continue to use the old asset, you will get how much salvage value? 0. But if you use the new asset, you will get a salvage value of 35,000. That means how much is incremental salvage value? 35,000. You will get that now or 10th year? Last year. Last year is 10th year. Second adjustment gone. If the problem is big, they will not give other adjustments. What are the third adjustment? Opportunity cost, not there. Then working capital, not there. Additional investment, not there. Oh, that's all it is. You have to just practice it once. You'll get it. Problem, no doubt, will be lengthy. Conceptually difficult. No. Yes, people, everybody cool with this? Then you will get your incremental cash inflows. But all these cash flows are on future value terms. But for NPV calculation, we need present value. How do you get that? By multiplying discount factor. This way you will get present value of cash inflows or present value of incremental cash. You will get present value of incremental cash inflows. How much is that? Adding all this, you will get 3,94,611. Okay, people. Do we want incremental cash inflow or we want incremental NPV? Incremental NPV we want. How do you get incremental NPV? Present value of cash inflow minus present value of cash outflow. But we don't want normal NPV. We want incremental NPV. So incremental NPV ka formula is present value of incremental cash inflow, which is this, minus present value of incremental cash outflow. Okay. So to buy new asset, how much you need to pay? 4.5. But when you buy a new asset, you will exchange old asset also. What is old asset ka value? 1 lakh. That means how much extra cash is going out? 3,50,000. Though the new asset ka value is 4.5 lakh, 1 lakh will be adjusted from old asset. That means net mein how much cash outflow will happen? Extra cash outflow will happen to the extent of 3,50,000. These two you minus, you will get incremental NPV how much? 44,661 or 611. Decision making is same. If the incremental NPV is 0 or greater than 0, accept the decision of buying new asset. Otherwise, reject. Here you got a positive number. So continue with the old asset or purchase new asset. Purchase the new asset. That's all it is. Everything you just have to work out under incremental approach. Any working note, any problem or fair enough? Okay, the takeaway is the depreciation. Depreciation under WDV works on block basis. As long as the block is there, depreciation will continue. Okay, the moment block comes to an end, depreciation also will stop. Okay, and how do you calculate the depreciation base? Take the WDV before sale. From that reduce sale value. To that you add purchase cost. Then you will get the depreciation base. On that depreciation base, go on charging the depreciation. Those are the two things we did. Okay, people. Now, this question is over. Okay. One more adjustment was there, but that was not relevant for this problem. Why is? Check here. They asked the information. So analyze whether the old machinery should be replaced or not, which we already did. Ignore what? Ignore capital gain tax. Capital gain tax. This was the 6th adjustment I was talking about. Okay. Now this problem, this has absolutely no adjustment because the question clearly told ignore capital gain tax. If this wordings was not there, we had to do one more adjustment. Can I explain that? This is just for our extra things because in our examination question, this wordings may be cut. In that case, one more adjustment is required. But this problem is solved. Now we are just speaking. If these words were not there, what we have to do? Okay, for that we'll have to just go back 1 minute. I'll tell you. I think I've written some pointers. This one. Okay, sir. Now, sir, I told, no, sir, depreciation in Income Tax Act works on a block basis. As long as the block is there, depreciation will continue. Let's analyze. At year 0, what did you do? Old asset you sold, new asset you purchased. That means that block has at least one asset. Block exists means at least one asset should be there in the block. If at least one asset is there in the block means block is continuing. If all the assets in the block is sold off means block has come to an end. Block has come to an end. At year 0, what did you do? Old asset you sold, but you replaced with a new asset. That means this block at least has one new asset. Block ended or block still continues. At year 0, block is continuing because new asset is there. Correct? But at the end of 10th year, what you'll do? New asset, you'll sell it at salvage value of 35,000. That means new asset you sold means any more asset is there in that block or damar? Block damar. That means block is not there. At the end of 10th year, this particular block has come to an end. Okay. Income Tax Act says whenever block ceases to exist, all these are again Income Tax Act calculations. Not FM, not accounts, purely income tax. What Income Tax Act says is once the block comes to an end, you'll have to calculate something known as short-term capital loss or a short-term capital gain. That's what we need to calculate. Okay. As per Income Tax Act, ideally, as per as my knowledge goes, in the year you sell an asset, when the block comes to an end, that year you should not calculate depreciation, as far as my knowledge goes. But ICA has done some small locha here, so let's not go into too much of that. I'll tell you what we need to do for our exam of FM. Okay. So what you need to do is here check. At year 10, this block there or block gone? This much understanding everybody is clear. Next, one more step you'll have to do, that's all. In this problem, not necessary, but if they ask you to calculate capital gain, how to calculate, I'll show it to you. Online also till here, okay? Can I show you the next table? 5 minutes, that's all. In case you're wondering, when will this guy stop his PT low? Drilling, another 5 minutes. This topic, class is not ending. Okay, they're saying good. Okay, what you'll have to do is at the end of 10th year, the new asset you will sell at a salvage value of 35,000. At that point of time, block will come to an end. Now what you have to do is at the end of 10th year, what is the closing balance of that asset? Here you already found out. At the end of 10th year, what is the closing balance of asset? 1,60,504. Yes, people? Okay, check here. WDV of the plant and machinery at the end of 10th year is what? 1,60,504. Okay? Correct? At the end of 10th year, new asset you will have or you will sell? 10th year, you will have the new asset or you will sell? sell at a salvage value of how much? 35,000. Ayyo, full sad face. Why? Sir, WDV is the worth of the asset. How much is the worth of the asset? As per tax record, the worth of the asset is 160,504, but you sold it only for 35,000. That means gain or loss. This we call it as loss on sale. How much is the loss on sale? 125,504. So this you already know. On loss, you will pay tax or you will get the tax benefit. You will get the tax benefit. This we call it as short-term capital loss. Okay, they will give you a rate. They will give you a rate. Short-term capital gain are taxed at the rate of 20%, 15%, like that. They will give you a rate. If they don't give you the rate, you can take business income ka rate. What is business income ka rate in this question? 30%. If they give a separate rate for capital gain, take that. Otherwise, you can take business income ka rate for our calculation. In this problem, did you see any separate capital gain tax, or in fact, they asked us to ignore? All right. In some problem, they will give capital gains are taxed at the rate of 15%. In that case, you will get tax benefit at 30% or 15%. 15%. If rate is not given, take normal tax rate itself. What is the normal tax rate? 30%. Now, on this loss, you will get, we already did carry forward loss. On loss, you will pay tax or get the tax benefit. Get tax benefit. So calculate 125,504 ka 30% is how much? 37,651. Now this tax benefit means, so when you pay tax, it's an outflow. When you pay tax, it's an outflow. This is paying tax or getting the benefit. I mean, this is outflow or inflow? Inflow. Every year you will get it, or 10th year. So this 37,651, you should take it as an inflow for 10th year. That is what I've written here, and I cancelled. I've written 37,651. I've cancelled. Why have I cancelled? Because question asked us to ignore this. If the question had not asked us to ignore, means this number I would have ignored or brought in. And I would call this as a tax benefit on short-term capital loss. That's all it is. Okay, sir. This is the 6th adjustment I was referring to. Check the problem. If they ask us to calculate, we will calculate. This drama will only come in the block concept. On straight line method, it will not come. Because in straight line method, at the end of the asset, closing balance of the asset will be equal to salvage value. You will sell the asset also at salvage value. That means gain or loss will be 0. So STCL, short-term capital gain, short-term capital loss ka drama will not come in case of straight line method. It will only come for WDV method. And you will do it only if the question asks. Or rather, you do it if question says to ignore, then only ignore. That is a better approach. Okay, do it. Do this STCL, STCG in every problem. If in this problem, should we have to do it or not required? Not required. Why? Because question asked ignore capital gain. That's all it is. Otherwise, this particular calculation with this number would have to be shown. I hope this is okay, everybody. This is the concept. That's all. I hope we have done two or three questions we have done on this on regular concept. But I think this is okay, manageable. No? Just what you have to do again, tell me the breakup of this. What is it? You just have to take WDV at the end of the 10th year. Whichever is the project ka ending life, that year ka WDV you take. Compare it with the salvage value. WDV minus salvage value you do. If you have sold it at a loss, means on that loss you will get tax benefit. Tax benefit you will show it as what? In our calculation as an inflow. Every year or last year? Last year you will have to show it as a benefit. That's all. Similarly, if I take ulta scenario, like here, check. Let's say WDV of this asset is 160,504. Assumption. WDV is how much? It's not an assumption. In this problem, how much is actually WDV? At the end of 10th year, when we calculated, we got 160,504. Suppose you sold this asset at a salvage value of 2 lakh. Assumption. Salvage value instead of 35,000, it is 2 lakh. Now sad face or happy face? Sir, worth of the asset in your, as per your tax record is 160. You sold it for 2 lakh. Assumption. I mean, this is loss scenario or gain scenario. This we call it as short-term capital gain. Sir, on your gain, you will get tax benefit or you have to pay tax. Pay tax. Tax at what rate? That will be mentioned in the question. If it is not mentioned, you can take normal tax rate of 30%. So calculate 30% of this. Calculate 30% of this. How much is it? 39,496 ka 30% if you calculate. You will get 11,848. Now this 11,848 you are getting or you are paying the tax? Paying the tax. So inflow or outflow? Outflow. Every year or 10th year? So in 10th year you have to take that as an outflow. That's all it is. So they can either, usually in our problem, they give you STCL. They'll give you a loss scenario. That is popular in examination. This can also be asked. Done now. This is one more concept in this particular question. Yes, people, I think my job is done. Okay. I think yes, I have reviewed all the things. Let me quickly check. Maybe one more, this one, some students gets confusion in this, so I'll quickly tell this. There is one more adjustment. Usually they ask for subsidy. Subsidy meaning you will buy an asset and government will give you subsidy. Government will give you some grant. Okay, subsidy questions can be formed in two ways. One, they will give you in the question, you have invested in special economic zone, SEZ. Okay, let us say the question will say, a company has made an investment in SEZ to the extent of 1 crore rupees. Okay, and because you have made an investment, government is giving a subsidy of 30 lakh. Government will have various schemes, no? Right? So since you have invested in the special economic zone, company wants to promote that zone. Okay, so because of that, they have given you a grant of how much? 30 lakh. Now you tell me, net mein how much money went out from your pocket? Though you invested 1 crore, how much grant government gave you? 30 lakh. That means how much money went out? 70 lakh. So 70 lakh at year 0, you will consider as an outflow. That is one. Okay, Saru. When you have invested in SEZ, basically you have purchased an asset. You have purchased an asset and doing some activity in special economic zone. On the asset, you all have to calculate depreciation. Now, if they say SEZ means you will calculate depreciation on 1 crore rupees. Don't calculate depreciation on 70 lakh. Calculate the depreciation on 1 crore rupees. If depreciation is 10% means apply 10% on 1 crore. This is one. If they use the word SEZ, okay, then you will calculate the depreciation not on 70 lakh but on 1 crore rupees. Okay, this is just an ICA treatment, okay, how they are working out their questions. Don't ask me the logic, okay, basically. In other question, what they will say is, sir, they will say, you have purchased a specific machinery. They will say, company has purchased a machinery. Because company has purchased a machinery, government has given a grant of 30 lakh. That means this grant is due to special economic zone or it's related to a specific asset. It's related to specific asset. How much did you buy the asset for? 1 crore. How much grant did you receive? 30 lakh. Both you received at same date. Okay, that means how much is your net cash outflow? 70 lakh. So 70 lakh you will treat it as year 0 ka. 70 lakh you will treat it as year 0 ka outflow. That is one. Okay, sir. Now you will not calculate depreciation on 1 crore. Now you will calculate depreciation on 70 lakhs. That is a distinction. If they say special economic zone, calculate the depre on 1 crore. If they say specific asset, you calculate the depreciation on 70 lakh rupees. These are the two problems. I think some students, they were asking some doubts. So this is a figure out. Way to figure out how to calculate the depreciation amount. Okay. Don't ask me in this case also, ideally, according to me, you should calculate on 70 lakh only. Maybe ICA ka thought process is, when you invest in special economic zone, right, you are not only investing in assets, you are in fact investing in the other points of the zone as well. That's the reason they are saying you calculate the depreciation on full amount, not on the net amount. Maybe that is their thought process. Difficult to say without information. Okay. But if the grant is related to any specific asset means now you will calculate depreciation on 70 lakh rupees and not on 1 crore. But both this should have happened on the same day. Both you should have purchased the asset and you should have received the grant on the same day. If you receive the grant after 2 years, 3 years and all, then you will calculate depreciation on 1 crore. Keep that in mind. That also they've asked in one question. Like this 2-3 ways they can ask this particular question as well. Done, people. So this was with respect to all this I've written, we have covered. That's okay. Yeah. So with this, I feel I've covered all the points that I thought about covering in investment decision. Thank you for your time and patience. Yo people, welcome back. So next we are revising our dividend decision topic with the help of our chart book. Okay. So this particular chapter ka summary is, or the thought process behind this particular topic is, can company affect the share price, or will the share price of a company get affected due to dividend decision? By paying dividend or not paying dividend, will the share price of the company get affected? That is what dividend decision ka whole funda is all about. Okay, people. All right. Usually, again, with just 1 or 2, there are various types of dividend. This is one type of popular question in exam. Types of dividend is, one is cash dividend. Cash dividend means you're paying the dividend in the form of cash, not necessarily cash. Cash here refers to cash and cash equivalent. Okay. Or another one is stock dividend. Stock dividend means bonus shares. Bonus shares means additional shares given to existing shareholders at free of cost. Another one is share repurchase. Because if you want to repurchase the shares also, you have to take the help of profit. All these are activities done with the help of profit. Hence, these are considered as forms of dividend. Usually 1 or 2 marks ka this gets usually picked up from this particular topic. Otherwise, mostly it's a numerical topic. Okay, now let's dive into more exam related things. Just like in capital structure, we had some theories, right? Here also for a dividend decisions also, there are some theories. Relevance and irrelevance theory. Irrelevance theory ka argument is whether company pays a dividend or whether company does not pay dividend, the overall value of the firm will be same. Value of the firm will not change due to dividend decision, whether you pay or don't pay dividend. And under irrelevance theory, you know, a great godfather, which is theory has come into picture. So theory is batting for irrelevance theory. Okay, so that is the irrelevance. So in this irrelevance theory, we'll have to remember 2 components. Okay, one, what is that first formula? Anybody remembers? P naught is given by the formula P1 plus D1 divided by 1 plus cost of equity. It's very simple actually. We are trying to find out the present value of future cash flows here. We are trying to find out the present value of future cash flows. Now, if you are owning shares in a company, means what is your return, sir? For a shareholder, what is the return? Dividend is a return. So you will take D1. Okay. And in future, you may also sell the shares. So P1, when you sell the shares, you will get the money, right? So this theoretical assumption is you may sell the shares at the end of first year because the period will not be given. Hence, we restrict it to first year. So we take first year price and we take first year ka dividend. So all this is what? Present value or future value? Future value. Are you trying to find out the value of the shares in future or we are trying to find out P naught? P naught means what? Current market price. So you take the future value and multiply by the discount factor. So how do you get discount factor? 1 divided by 1 plus I whole power n. We are doing this calculation for first year. Hence the formula is simply what, sir? 1 divided by 1 plus I whole power 1. I here refers to cost of equity. Basically, this is nothing but 1 divided by cost of equity is there. No, this is nothing but your discount factor. This is the future cash flows. You are multiplying that by the discount factor. Automatically, you will get what, sir? Present value denoted by the symbol P naught. So P naught is given by, anyway, you have to remember all this. They will not give this. So P naught is given by P1 plus D1 divided by 1 plus cost of equity. 1 plus cost of equity here is nothing but your discount factor. Through this formula, you are trying to find out the present value of future cash flows. That's all it is. That is one. Okay, next here is you will have to find something called delta N. You'll have to find something called delta N. For delta here means, delta means change. Okay, that means what we are trying to find out is, okay, sir, let us say company has an earnings of 1 lakh rupees. Currently, company has an earnings of 1 lakh rupees. Using this earnings, company, let's say, wants to give a dividend of 20,000. So how much earnings remains? 80,000. So the retained earnings is how much, sir? 80,000. So now if company wants to do any expansion, how much amount or how much profit is available? The profit available for expansion is only 80,000. Let us say for expansion activity, we need 4 lakh. For expansion activity, we need 4 lakh. We need 4 lakh, but amount available is only 80. Do we have shortage? We have shortage? Yes, shortage. We need 4 lakh, but we have only 80. So how much is the shortage? 3,20,000. If you have shortage, you'll have to raise that shortage. Here, theory ka hypothesis is you will raise that shortage by issuing extra equity shares. You will raise this money by issuing extra equity shares. You will get the shortage now or in future? Future. Hence, you will get the delta N. Delta N is the number of shares. You need how much money from new shares? By issuing new shares, you need 3,20,000. You will not raise this shares now. You will raise it at the end of first year. So at the end of first year, what is the price of the share? Is it P0 or P1? P1. So you will take this shortage and divide it by P1 you'll have to do. Assuming if P1 is 32 means how many shares will the company raise? You need 3,20,000 and the price of the shares expected at the end of first year is how much? 32 assume. That means how many shares extra you'll have to raise? 10,000. That extra shares only we call it as delta N. So delta N is simply given by the formula shortage divided by P1. And how do you get that shortage? Take the earnings. From earnings, you have to reduce the dividend. You will get amount available for investment. Compare it with the amount required for investment. That way you will get shortage. Shortage you will get in the future. That shortage is made good by raising extra shares. That extra shares only we call it as delta N. Delta N is given by the formula again, shortage divided by P1. Okay, people, this is the second working note we need to put up in this particular approach. We'll apply it in the problem, but once saying. All right. Then value of the firm here is given by n plus delta n into P1 minus investment plus earnings. Okay. So value of the shares, how will you get, sir? Total number of shares multiplied by market value. So now we have only n or we have delta n also. N is the existing shares. So delta n is the new shares. So adding these two, what are you going to get? Total number of shares. Okay. Multiplied by this delta n, you will get it now or when you raise the shares in future. Here the expectation is you will raise the share at the end of first year. That means you will take P, you will multiply by P0 or you will multiply by P1. P1. That way you will get the market value of shares. You will get the market value of shares. We want the value of the firm, right? So in this, some amount will be used for investment. So deduct that. Some amount you already have in the form of earnings. So this is considered as the value of the firm. But here, this is the value of the firm now or at the end of first year. End of first year. But we want the value of the firm now. Hence, we have to multiply by discount factor. That is given by 1 plus cost of equity. This is nothing but your discount factor. By doing this, we will get the present value of your firm, or that's simply called as value of the firm. Okay. So as per approach, when you find this value of the firm, whether the company pays dividend or whether the company does not pay dividend, value of the firm will be same. That is what we have to prove. Okay, Saru? All right. So can we take up one question just to apply this? Okay, this is one popular. The dividend decision is a very small topic. There are roughly, I think, around 4 or 5 types of questions. That's all. ICI usually will play around those questions only. Okay. First type of question is around theory. Okay. So let's see how that gets applied. Let's take up one question. Where is it, Pa? Yeah, I think this one. An engineering company or engineering limited belongs to a risk class for which capitalization rate is 10%. So capitalization rate here refers to cost of equity. Okay. Then this only, 1 minute, let me check. It currently has outstanding how many shares? 10,000. So 10,000 shares is already there. Shares already there. We call it as what? N. Okay. And they're currently selling at what value? These shares ka current selling price is how much? 100. That means these shares are currently traded in the stock exchange at 100. So current price only we call it as P0. Okay. The firm is contemplating, as in thinking, the declaration of dividend of 5 rupees per share at the end of current year. So this 5 rupees dividend is already paid or company wants to pay. At the end of first year, company is thinking we may pay a dividend of 5 rupees. That means this is D0 or D1. Dividend already paid is denoted by the symbol D0. This is already paid or thinking to pay. That too at the end of first year. I mean, this is what, sir? D1. Okay. It expects to have a net income of, company is thinking that it will have an expected income of how much? 1 lakh. And it has a proposal for new investment. How much? For your new investment, how much money you need? 2 lakh rupees. You need to find out the value of the firm when dividend is paid, when dividend is not paid. And we know whether dividend is paid or not paid, value of the firm will be same. You just have to calculate and you have to get the same exact value. Can we do it? Okay. First one. First working note is what, sir? To find, first you will get P0. P0 is equal to P1 plus D1 divided by 1 plus cost of equity. But we'll have to solve under one approach or two approach? Two approach. First, when the dividends are not paid. So first let's solve when the dividends are not paid. So P0 is given by P1 plus D1 divided by 1 plus cost of equity. P0 we have to find or given in the question? Given. Currently the shares are trading at what price? 100. P1 do we know or we have to find? In fact, this is the formula to find out P1. Okay, so P1 we don't know, not given. This is what scenario is this? Dividends are not paid. If dividends are not paid means D1 will be how much? 0. Divided by 1 plus cost of equity. Cost of equity, I think they told it is 10%. So this is 0.1. Done. When you solve this equation, you will get P1 to be how much? 110. This is the first working note to find out P1. Any problem or confusion? No. Can we go for the next one? Next working note is to find out delta N. Delta N is new shares that the company might have to issue. So we'll see that. First, for that, we'll take what, sir? Expected earnings. How much is the expected earnings given in the question? 1 lakh. Minus dividend. In this scenario, company is planning to pay dividend or dividend is not paid. So minus dividend is how much? 0. If you have earned 1 lakh and if you have distributed 0 dividend means how much earnings is available for investment? 1 lakh. You have 1 lakh earnings, but for investment we need 1 lakh or we actually need 2 lakh? For investment we need 2 lakh, but we have only 1 lakh. Do we have any shortage scenario here? Yes. How much shortage is there? 1 lakh. How do you make good this shortage? If you have shortage of money, means what you'll have to do? Here you'll have to issue extra shares. That extra shares only is denoted by the symbol delta N. How do you get delta N? Shortage, which is 1 lakh divided by P1. Okay, P1 you already know. How much is that? 110. So 1 lakh divided by 110, if you do, you will get 909. Here in this case, may always round off. Don't use mathematical round off. Always round it off to the higher number, next number. If you get 909.09, take it as 910. Okay, because if you take 909, you will not get 1 lakh. That's the reason. Here you round off to always to the next number. Doesn't matter what the decimal is. Don't use mathematical approach. Okay, people. In fact, for these sort of problems, you don't find this number. You are anyway having fraction. No, keep this fraction. Anyway, it will get nullified later on in the next formula. So keep it as it is. No need to simplify it further. Only if the question says number, find out the number of shares newly to be issued. Number of shares newly to be issued. Then solve this and select the answer 910. Otherwise, keep the fraction as it is, because you can avoid the decimals in this. This is your second working note. Okay, G. Next, finding out the value of the firm. Tell me, how do you get value of the firm? N plus delta N into P1 minus investment plus earnings. Sir, N is number of existing shares. How many existing shares we already have? Somewhere they told 10,000. So take that. 10,000 is the existing shares plus delta N. How much is the delta N? 1 lakh divided by 110. I'm not solving. I'm keeping the fraction as it is. So this is your N. This is your delta N multiplied by P1. How much is P1? We got it just now. P1 we got it to be 110. So multiply 110. Okay, G. Minus investment. How much you require for investment? 2 lakh. Plus earnings. How much earnings is available? Rather, earnings is 1 lakh. Divided by 1 plus cost of equity. Cost of equity is given in the question to be 10%. Solve this question. You'll get the value of the firm to be 10 lakh rupees. This is the value of the firm when the dividends are not paid. Now, the same working we'll have to do when the dividends are paid. Can we do it, or you need some time for reviewing? This is okay. A simple calculation. Plain numbers you'll have to update in the formula and get it. So next, same question we have to solve when the dividends are paid. How much dividend is the company planning to pay? They told us a problem. The company is expecting to pay a dividend of 5 rupees. So let's calculate now. Same drama. First working note is to find out P1. But P0 is given by the formula P1 plus D1 divided by 1 plus cost of equity. P0 is same. Currently the shares is trading at a value of 100. P1 we don't know. That's what we are trying to find. D1. How much dividend per share company is planning to pay? 5 rupees. This is the dividend paid scenario. Okay. So dividend is how much? 5 rupees. Divided by 1 plus cost of equity. Cost of equity is 10%. So when you solve, you will get P1 to be 105. Next step is to find out delta N. For delta N, what do you take first? First, you will take the earnings. How much is the earnings given in the question? 1 lakh. Reduce the dividend. Sir, how many shares currently company has? 10,000. How much dividend are they planning to pay? 5 rupees per share. Currently, they have 10,000 shares, and on one share, they are planning to pay a dividend of 5 rupees. Means how much money will be used for dividend? 50,000. Out of 1 lakh, 50 will go away for dividend. Means how much amount is available for investment? 50,000. But how much you need for investment as per the question? As per the question, you need investment of 2 lakh. 2 lakh you need, but you have only 50. Do we have any shortage? Yes. How much is that shortage? 1,50,000. Okay, Zaru. That shortage, what will you do? For that shortage, what will you do? You will cover that shortage by issuing new shares. So that only we call it as delta N. Delta N is given with the formula shortage divided by P1. Shortage here is 150. P1 here is 105. Should we have to solve this or keep the fraction as it is? Only if they ask the new shares or delta N, you solve this and take the number of shares. Otherwise, you can keep the fraction as it is. Anyway, it will get cut off. Next is value of the firm. Value of the firm, how do you get? N plus delta N into P1 minus investment plus earnings, whole thing divided by 1 plus cost of equity. N is the number of existing shares, which is 10,000. Delta N is 1,50,000 divided by 105 into P1. When you keep fraction, no, this 105 anyway will get cut off. That's the reason you don't have to solve this fully. Okay. Then minus investment of 2 lakh plus earnings of 1 lakh divided by 1 plus cost of equity. Substitute, you will get how much value of the firm? 10 lakh. So earlier also when the dividends were not paid, value was 10 lakh. Now when dividends were paid also, value is 10 lakh. Changed or same? Same. That's the reason Approach is saying dividend is an irrelevance theory. Whether you pay dividend or you don't pay dividend, value of the firm will be same. Okay, this is one kind of question they ask from Approach. Another way they can also ask is, they will ask you value of shares, not value of firm. They will ask you value of shares. So to get value of firm, what do? N plus delta N into P1 minus investment plus earnings. You're not finding value of the firm here. You have to find only value of shares. If they ask you to find value of the shares, you just have to take the total number of shares and multiply it by P1. That total number of shares only, we're calling it as N and delta N. So if they ask you by chance value of the shares, then you will do N plus delta N into P1. That's all. N plus delta N into P1. So calculate how much is the N? 10,000. How much is delta N here? 1,50,000 divided by 105 into P1 is 105. When you calculate that, you will get how much? 12. So this also, value of the shares also, whether you pay dividend or you don't pay dividend, value of the shares also will be same. If you want, you can calculate for here. When we don't pay dividend, what is the value? Value of the shares is given by how much? Value of the shares will be given by same. N plus delta N into P1. N is the number of existing shares, which is how much? 10,000. Delta N was how much here? When dividends were not paid, delta N was 1 lakh divided by 110. Okay, into P1 you have to do. P1 was how much here? When the dividends were not paid, P1 was 110. So solve this equation for me. How much you're getting? Tell me. You're getting same number, 12 lakh. Here also 12 lakh. Here also 12 lakh. This also sometimes they've started asking. Instead of value of the firm, they may ask you value of shares. If they ask value of the shares, just do only this much portion. That's all it is. Okay, Saru. This is one kind of question from Approach or from this particular topic they ask usually in examination. One is Damaru, another 2 or 3 more is there. Can we review that? Okay. Come back to our chart book. So this is done. Next one is relevance theory. Relevance theory ka argument is, no sir, dividend is relevant. By changing your dividend policy, price of the shares can be increased, or for that matter, price of the shares can also be reduced. That is what relevance theory ka argument is all about. Under relevance theory, we have 2 people, Walter sir and Gordon sir. Walter and Gordon. Again, you'll have to remember the formula. Okay. As per Walter sir, the price of the share is given by the formula D plus R into E minus D divided by cost of equity. Whole thing again divided by cost of equity. I explained you the logic of this formula also. It's like this. Sir, if you take investment amount, let's say you want to invest an amount of 1 lakh. Okay, or maybe I'll just tell it in orally. Investment amount into return amount, if you do, you will get the return percentage. Do you agree with me? Okay, or maybe I'll give the amount. Suppose you want to invest 10 lakh rupees. You want to invest 10 lakh rupees. You are expecting a return of 10%. As an investor, you are expecting a return of 10%. That means how much return in amount are you expecting? 10,000. Okay, Ji. Now, if I give you the return percentage and if I give you the return amount, can you find out the investment amount for me? How do you get investment amount? Tell me. Return amount divided by rate of return. That's all. Yes. Now let's see. Sir, if you want to get return means here and all we are analyzing from equity share perspective. If you want to get return means first you have to buy equity shares. Sir, all this investment are analyzed on a per share basis, not at total level, on a 1 share basis. Okay. Sir, if you want to buy 1 share means you have to invest P naught. Do you agree with me? P naught means what? Price of 1 equity share currently. That becomes your investment amount. Any problem? Okay, Saru. Return, rate of return only we call it as cost of equity. Correct? No, because cost of equity is return expected by the providers of finance. For the investor, it's a return. For a company, it's a cost. But this only is referred to as cost of equity. Yes, people. And here we need a return amount. Sir, if you buy any company ka equity shares, what will you get? Dividend. You will get dividend. Dividend is a return. Hence, return is given by D. Correct? One form of return is D. Okay, now here let's check this. Suppose a company earned an EPS of 10 rupees. Company ka earnings per share is 10 rupees. Sir, should they have to distribute entire 10 rupees as dividend or their choice? Their choice. Let's say dividend per share is only 2 rupees. Dividend per share is only 2. That means how much has the company retained? 8. Company has retained 8 rupees. Sir, if company has retained 8 rupees means what will they do with this 8 rupees? Will they keep this money idle or reinvest? And when they reinvest this 8 rupees, company will get some extra return. That means by reinvesting, let's say company has earned a return of 20%. That means how much is this? 1.6. This 1.6 also belongs to whom? Equity shareholder. So that means this should you ignore or consider this? Consider this. That's what the formula is trying to calculate. Okay. First is you will consider D. D is the return paid. Okay. Plus what, sir? How much our company earns, entire dividend should they have to, entire amount they have to distribute as dividend or their choice? Here in my example, earnings was 10, dividend was only 2. How much did the company retain? 8 rupees. This is your retained amount. On the retained amount, company will generate some return. So hence that return percentage, I've assumed it to be in this my example 20%. So that is what is R. That is what is R. If you do R into E minus D, what are you going to get? 1.6. Correct, no? Yes, people? Yes. Sir, the company will do this retention activity once or forever? Forever. It will go on for infinity. To capture that, we divide by cost of equity. So that's all it is. Done, people? So this is the return amount. This is the return amount. This is the P naught. This is the rate of return. This is the return amount. Now, if you want P naught in this formula, what you will do? If you want only P naught, what you will do in this formula? D plus R into E minus D divided by cost of equity. This cost of equity, you will also send it to the other side. Again, it will become whole divided by cost of equity. That's all this is formula all about. Okay, sir? Not that they will ask you logic for it, just that you need to remember it for examination. Tell me once again, how do you get P naught under Walter Sir's formula? Return, basically you have to take. What are the returns? D plus R into E minus D divided by cost of equity. Again, whole thing divided by cost of equity. That if you do, you will get the price of the share as per the Walter Sir's model. This is one. Done, people? Okay. I think 1 second. Hang on. I have one question. Or maybe I'll do off 1 minute. I'll just check that question. Is it possible to do it now? Give me a minute. Just check that. Oh, no. Okay, or maybe I'll explain this and then do it. Okay. All right. So this is okay. Walter Sir's formula, we are through with this now. Okay. There is something called optimum dividend payout ratio. Optimum dividend payout ratio. And this optimum dividend payout ratio as per Golden Sir and Walter Sir are same. Okay. What is this is? If R is greater than cost of equity, optimum dividend payout ratio should be 0%, meaning company should not give any dividend. If R is lesser than cost of equity, then optimum dividend payout ratio should be 100%. So dividend payout ratio is always expressed on EPS. Do not forget that. So if R is lesser than cost of equity, 100% of EPS company should distribute as dividend. However, if R is equal to cost of equity, if R and cost of equity, if it is same, then there is no optimum dividend payout ratio. Meaning whatever payout ratio you adopted, that itself is optimum dividend payout ratio. These are the 3 things. Okay, the simple logic also here. Check. Let us say, sir, company. Sir, when company raises their money from equity shares, will the company keep the money idle or utilize? Utilize. They will do some project. From that project, they will get a return. Let us say from that project, company has got a return of 15%. Company has got a profit of 15%. Okay. To do this project, company raised money. So on the money, they have to pay some cost. They'll have to incur some cost. That only we call it as what? Cost of equity. But because here money is raised by issuing only equity shares. Let's say cost of equity is only 10%. Now you tell me this is a loss-making project or a profitable project? Profitable project. How? Sir, money is raised through equity and the money ka cost is how much? Cost is only how much? 10%. But that project is generating how much return? 15% return. Cost of the project is 10, return of the project is 15%. That means it's a profitable project. Sir, if it's a profitable project, would you like to run this project only once or as many times as possible? If it's a profitable project, means you want to do this project as many times as possible. That means you tell me if company has any earnings. Now, will the earnings be distributed by the company to the shareholder as dividend or they will use this for project? Since company is running profitable project, would company like to distribute their earnings as dividend or reinvest the money? Whatever earnings they have got, they would like to reinvest in the project because they will get more return. That is what this optimum dividend payout ratio is trying to say. If return is there greater than cost of equity, means company is doing a profitable project. When company is doing profitable project, should they give dividend or they should not give dividend? Hence, a dividend payout ratio should be how much? 0%. That's what it is. Okay, sir. If the equation is ulta, if R is lesser than cost of equity, then it's a profit making or loss making? loss making. In that case, whatever earnings the company has incurred, 100% you give it as dividend. That way you will get the optimum share price. If return and cost, if it is same means, then what, sir? There is no optimum dividend payout ratio. Whatever dividend the company is paying, that itself is optimum. They can pay 0%, 1%, 10%, 15%, 100%, doesn't matter. Whatever you pay, everything is considered as optimum. Okay. This is what is, the optimum dividend payout ratio as per both Walter as well as Gord. Now, can we go ahead and apply this in one question? We'll take it concept by concept and apply them in the question. Where is it? Here, check. The following information is supplied to you. Again, this is also a study material question. Total earnings is 2 lakh. Okay. 1 minute. Help me recollect that formula. For Walter sir, what is the formula again? Tell me again. P naught is equal to P naught is equal to D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. Sir, D here stands for dividend per share. R for rate of return on investment. K for cost of equity. E for earnings per share. Earnings per share. Okay, so that means all this data is on a per share basis. Now, keep this in mind and read the question. They gave you EPS or they gave you total earnings? Total earnings. How much is that? 2 lakh. And they give you a number of equity shares to be 20,000. Each share ka face value is 100. So, for our Walter, this is a Walter's model. Okay, they will mention the model. You don't have to worry. This is a Walter's model. Walter's model takes the total earnings or earnings per share. Earnings per share. Total earnings is 2 lakh and number of shares is 20,000. How do you get EPS? This total earnings means each. This is nothing but your each. So each divided by number of equity shares. 2 lakh divided by 20,000. How much is that? EPS is 10 rupees is what indirectly they're trying to say. So that means you got your E-wala data. Okay, next. Dividend paid is 1,50,000. Sir, this is dividend paid on one share or total dividend? For our Walter, sir, we want dividend paid or dividend per share? Dividend per share. How do you get dividend per share? 1,50,000 is a dividend that you paid on 20,000 shares. On one share, how much dividend are you paying? 1,50,000 divided by 20,000, which is 7.5. That gives you your D wala number. So D, E, we have worked out here through this formula. Okay, Saru. That was not given directly. We worked it out. Okay, next, they have given P ratio. P multiple, in fact, P multiple is how much? 12.5. Sir, how do you get P multiple? Tell me. P multiple, how do you get? Name itself is saying PE multiple. So, price divided by earnings. Price we call it as MPS. So, P is given by the formula MPS upon EPS. Okay, sir. Alright, but hang on. Do you remember when we discussed yesterday cost of equity? There were various models to find out cost of equity. One was dividend price approach given by the formula DPS divided by P naught or MPS. Then we discussed earnings price approach. In earnings price approach, what is the formula? EPS by MPS. EPS by MPS. Check. P multiple is MPS by EPS. Cost of equity is EPS divided by MPS. That means by looking at this formula, what analysis can you draw? Ulta relationship. Yes or no? A P ratio is MPS by EPS and K cost of equity is EPS by MPS. That means indirectly can I say cost of equity is reverse of P multiple? Correct? No? Using the formula. This formula has got reversed over here. Correct? No, sir? That means what? Cost of equity is given by the formula 1 upon PE multiple. If they give you PE multiple, indirectly you can also find out cost of equity. So cost of equity is nothing but 1 divided by PE multiple, which is 1 divided by 12.5, which is how much? 0.08. Cost is expressed in percentage. So percentage is how much? 8%. For our formula, we need cost of equity. No? So that they had not given. Instead of cost of equity, they had given PE multiple. So we used PE multiple and got cost of equity. 1 divided by 12.5 if you do, you will get 8%. That is your cost of equity. Easy. That means almost all the data we have got it. So D we have, E we have, D also we have, cost of equity also we have. The only question mark here is what, sir? R. R is rate of return on your investment. We read the data. Anywhere we found? No. Okay, let's read the data fully. Applying Walter's model, you need to tell whether the company is following optimum dividend policy. But hang on, to find out optimum dividend policy, we need to find R. Is R given directly? No. R is not given. But indirectly it is given. Can you tell me how? Sir, this is each. This is each. This is each. And how much equity shares the company has? 20,000. Each ka face value is how much? 100 lakh. That means what is equity share capital? 20 lakhs. 20 lakhs. Company has raised equity share capital of 20 lakh, and how much each they have generated? 2 lakhs. So basically, indirectly, I'm asking you what is return on equity? How do you get return on equity? How do you get return on equity? Just today only we did. Return on equity is given by the formula each divided by equity. Correct? No. How much is each in the problem? Here they have given the each in the problem to be 2 lakh divided by equity. Equity means equity share capital plus reserves and surplus. Is it mandatory for a company to have reserves and surplus? No. They may have, they may not have. How much is equity share capital? 20 lakh. The return is expressed in percentage. So multiply by 100. How much is that? 10%. So return is also given here, not in a direct fashion. That's all. So these are some working notes you need to first put and then solve. That's the reason I chose this particular question. Okay, Saru. So all this data given. So you have R also now. You have every information we have found out. Any questions, sir? No. But did they ask you to find out price of the share in the first requirement check? What did they ask you to find out? Analyze whether the company is following optimum dividend payout ratio. So check. We got it. R, how much did we get? 10%. Cost of equity also we got it as a working note. How much we got it? 8%. So cost of equity is 8%. R is 10%. What is optimum dividend payout ratio, sir? If R, if three scenarios. If R is greater than cost of equity, optimum dividend payout ratio should be 0. Okay, that is one. If R is lesser than cost of equity, optimum dividend payout ratio is 100%. If R is exactly equal to cost of equity, is there any optimum or no optimum? No optimum, or you can say whatever you pay, that itself is optimum. You can pay whatever percentage. Here, which scenario is being played? R is 10%, cost of equity is 8%. That means R is greater than the cost of equity. If R is greater than the cost of equity, ideally dividend payout should be 0. That means dividend should be paid or it should not be paid. But the company has already paid the dividend. So is company following optimum dividend policy as per Walter model, or they are not following? They are not following. That's what you need to write here. The plain theory. You don't have to work it out here. Simply put up a few components as a working note. First find cost of equity, R and all. As a working note you find out. Then give the answer. What is the answer? R is 10%, cost of return is, or rather R is 10 and cost of equity is 8%. Since R is greater than cost of equity, optimum dividend payout ratio as per Walter model should be 0. But this company is currently paying the dividend. That means they are following optimum or they are not following. They are not following. That's all you need to do. First requirement done. Can we go through the second requirement of this question? Okay, what are they asking in the second question? Compute P ratio at which dividend policy will have no impact on the value of the shares. Sir, when will the dividend policy have no impact on the value of the share? When R is equal to cost of equity. Because when R is equal to cost of equity, is there optimum dividend payout ratio or no optimum? No optimum. Or you could say whatever you pay is optimum. Whatever you pay, price of the share will remain constant. When will that happen? This will happen only when R is equal to cost of equity. How much is the return you have generated? Return is cost of equity is expected number. Cost of equity is what? Return expected by the shareholders. But R is a actual number. That means what, sir? You should always take. How much is R? How much is R achieved? R is how much? 10%. So, right? If R is equal to 10% means the K also should be equal to 10%. If K is also equal to 10% means then the dividend policy will not have any impact on the value of the shares. Okay, sir. But did they ask you cost of equity or did they ask you PE multiple? They ask you PE multiple, but we have a relationship. What relationship we have? Inverse relationship. Sir, how do you get cost of equity? 1 divided by PE multiple. Therefore, how do you get PE multiple? PE multiple also will be equal to 1 divided by cost of equity. How much will be PE multiple then? How much is the cost of equity? If R is 10% means cost of equity also should be equal to 10%. That means PE multiple should be how much? 10 times. If PE multiple is 10 times means whatever dividend you pay, price of the shares will be same. Because there is no optimum dividend payout ratio in this particular number. Okay, Zaru? And don't equate this to be, what is cost of equity we got previously? Cost of equity we got it as 8%. Don't equate R and cost of equity to be 8%. Why? Cost of equity is actual number or expected number? Expected number. Which is actual number? R. So first find R. How much is R? 10%. If R is 10% means cost of equity also should be equal to 10%. Only in that case, my dividend policy will not have any impact on the value of the shares. Okay, sir. If you want to prove this to you, here just check. I've just found out. Okay, sir. R is how much in this problem? R is equal to how much? 10%. So there is no optimum dividend payout ratio means cost of equity also should be equal to 10%. So let's work it out. How do you get price of the share as per Walter's model? D plus R into E minus D divided by cost of equity. Whole thing again divided by cost of equity. Let's assume some random scenario. First case, let's say company is paying a dividend of 50%. Dividend payout ratio is 50%. You can assume any percentage, 0, 10%, 20%, 50%, 100%, whatever. I've assumed two cases just to prove a point. This is not required, just for your reference. Let's assume dividend payout ratio is 50%. Sir, how much is your EPS? We already worked out. EPS is how much, sir? Where is it, pa? Okay, I'll have to go back to the previous slide. How much is a PV worked out? Earnings per share is 10 rupees. So EPS is 10 rupees. Okay. Sir, in the first case, I've assumed that the dividend payout ratio is 50%. Payout ratio is always expressed on EPS. How much is EPS? 10. And how much the dividend I've assumed the company is paying? 50%. So how much will be dividend then? If EPS is 10 means the dividend will be paid to the extent of 50% of it. So dividend will become how much? 5. 110 ka 50% which is 5. Plus R. R is how much? 10%. Cost of equity is also 10%. Into E minus D. What is earnings per share? 10. What is dividend per share? 5. Divided by cost of equity. If you do it, what is the price of the share? When you solve this, okay macha. If you don't understand, you can tell. No need to throw things. So, what is the price of the share? Currently, if dividend payout ratio is 50% means as per Walter model, the price of the share will become 100. Okay, sir. Now, let's change this. Instead of 50%, let's make it as 100%. You can take any number. 100% is a dividend payout ratio. Let's see what will happen. Sir, how much? Earnings is how much? 10. How much dividend payout ratio I've assumed? 100%. That means whatever you earn, company will distribute that as dividend. Company has made an earnings of how much? 10 rupees. So how much dividend company will pay? 10 rupees. Plus R. R is 10% divided by cost of equity is also 10%. Into E minus D. E is how much? 10. Dividend is also how much? 10. Whole thing divided by cost of equity. When you solve this also, how much is the price? 100. Price changed or same? Same. That is what Walter sir is trying to say. If R is equal to cost of equity means you can adopt any dividend policy. Price of the share will change or it will not change. It will not change. That's what they ask. Okay, Saru. This is just for your reference. I put it. Not required for exam. If you do it also, not a big deal. Just say. You don't have to assume 10% also. You can assume 0%, 10%, 15% also. You solve, you would still get the number as 100 only. It will not change. Okay, G. I think this is done. Any other? I think this question is solved or still any other requirement is there? Okay, they ask one more. Will your decision change if P ratio instead of here, how much they have given P multiple? 12.5. Instead of 12.5, they're saying if P multiple is 8, will your answer change is what they're asking. Sir, if P multiple is 8 means what will be your cost of equity? Cost of equity, how will you get? Cost of equity will be 1 divided by P multiple. P multiple is now 8. 1 divided by 8 is how much, sir? 0.125 or how much? 12.5%. 12.5%. Now cost of equity now has become how much? 12.5%. But R is still how much? R is still 10%. Which equation is playing out here? R is a 10%. Cost of equity is 12.5%. That means profitable project or loss making. From your project, you are generating a return of only 10, but your providers of finance are expecting a return of 12.5, or rather cost of the finance is 12.5. If R is lesser than cost of equity means as per Walter, what is optimum dividend payout ratio? 100%. That means obviously your decision should change. Is company currently paying 100% of earnings? No, check. Currently their earnings is how much? 2 lakh. Are they distributing entire 2 lakh or only 1.5 lakh? That means company is following 100% as dividend policy or they are not? They are not. That means you need to call out that and tell. That's what I've done over here. Okay. Last case, if P multiple becomes 8 means cost of equity will become 12.5. R is still 10% only. Since R is lesser than cost of equity, optimum dividend payout ratio should be 100%. If you want, you can find out that at optimum dividend payout ratio, what is the price? Sometimes that also they ask. At optimum dividend payout ratio, find out the price of the share. How do you get price of the share? D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. Sir, how much is the earnings per share over here? 10 rupees. So if R is lesser than cost of equity means how much should be the dividend payout ratio? 100%. Meaning whatever you earn, entire earning should be distributed as dividend. So D will become how much? D will become 10 plus R. R is 10%. Cost of equity we got it to be 12.5% into E minus D. E is 10. D is also 10 divided by cost of equity. If you do, the price of the share will become 80. At the optimum dividend payout ratio, the current price of the share will become 80. If they ask to do it, otherwise not required. That's all this question is all about. A good question, theoretically, to understand the concepts and all. So, MM model done, Walter done. Can we go on to the next one? Wait or carry on? Carry on. More like the feeling now is move out of the classroom. Yes, no? Yeah, not move on. Yes. Okay, next is Gordon sir. Gordon sir also will come under relevance theory. One happy news for you. Gordon sir is not a new formula. You know this. You've already done. How do you get cost of equity? Tell me. Test our memory. How do you get cost of equity, sir? D naught into 1 plus growth rate divided by P naught minus flotation cost, whole thing added by the growth rate. In this problem, flotation cost will not be given. Hence, the formula will be D naught into 1 plus growth rate divided by P naught plus the growth rate. Sir, instead of D naught, if they give you D1 means, the formula will be D1 divided by P naught plus the growth rate. Now, very simple. Sir, here in this problem, are we trying to find out cost of equity or are we trying to find out price of the share? Price of the share. You just have to substitute. That's all. So, what you will do over here? This also, I think we proved it in one of the previous problems. So, P naught is given by what formula? D0. If you're working from D0, the P naught is given by the formula D naught into 1 plus growth rate divided by K minus G. Or you can get P naught as, instead of D naught into 1 plus growth rate, directly you can take D1. D1 divided by K minus G. If you're using this formula. Correct, no? Yes, confusion. No, if you are using this particular formula means you just have to substitute. Okay, K, G will go to that side, P naught will go to that side. You have to prove this formula once again. Or okay now. This we have done, sir. We have done. I think one day. Yesterday only we did. Yeah. So this particular, it depends on the question. Either you will use D naught or D1 depending on what information is given in the question. So basically P naught is given by the formula D naught into 1 plus growth rate divided by cost of equity minus growth rate. Or P naught is equal to D1 divided by P naught, K minus growth rate. Depending on D naught or D1, you will use one of these two formulas. This is one. Okay, G. Alright. 1 second, hang on. There is another formula to calculate the same thing. That is P naught is equal to E1 into 1 minus B divided by K minus BR. What is this? Very simple. Sir, E1 is your expected earnings. E1 is your expected earnings. B you already know. What is B here? Retention ratio. Retention ratio means how much earnings is given as dividend or how much is earnings is retained. How much earnings the company has kept with itself. Okay, let's take a small example. Let us say B is equal to, or EPS is equal to 10. EPS is 10. Let's assume. Company wants to retain 80%. Company wants to retain 80%. Is this creating problem? I'll have to figure out now. 80%. 80% means what is the funda? How much our company earns. Company wants to retain 80%. That means how much is the dividend the company wants to pay. The company wants to pay a dividend payout ratio of 20%. Sir, 80% if they're retaining means 20% they will pay out. So how do you calculate that? 100 ka 10 ka 20% is how much you do. That means the dividend per share company wants to give is how much, sir? 2 rupees. Comfortable? Or there is another way to calculate this. You take E1 into 1 minus B. How much is the EPS, sir? 10. How much is EPS? 10. Into 1 minus B. How much is B? 80%. 80% in full form is 1.8. Calculate this. How much did you get? 2. Same number you're getting. Yes or no? So instead of D1, you can write E1 into 1 minus B. If you do E1 into 1 minus B, automatically you will get what? D1. That is another way of calculating this. Because 1 minus B, B is retention ratio. 1 minus B, if you do, you will get automatically dividend payout ratio. So earnings into dividend payout ratio, if you do, you'll obviously get dividend. This is actual earnings or expected? If you take expected earnings and multiply dividend payout ratio, you will get actual dividend or expected dividend? Expected dividend. That's all. These are the three. Depending on what data they've given in the question, one among these three formulas will be used. Okay, people. That's all is this. Yes. Okay, tell me once again. Let's recap. Gordon says, what is the formula? P naught is given by the formula. One is, if let's say work from D naught angle first. So is equal to what? D naught into 1 plus, or rather P naught is equal to D naught into 1 plus growth rate divided by cost of equity minus growth rate. That is one way. Or P naught is equal to D1 divided by cost of equity minus growth rate. Or another one, P naught is equal to E1 into 1 minus B divided by cost of equity minus BR. Because growth rate, how do you get, sir? G is equal to B multiplied by R. Instead of G, you can substitute with BR. Okay, not BR, BR. Okay. All right. This is your another way. Just a pure substitute of the things. That's all. Depending on whatever information they've given, one among these three you use and calculate it. And Walter Circa and Gordon Circa optimum dividend payout ratio is same. No change. Now, can we apply this in one of the problems? Okay, come to which question? Question number 4. Again, study material question. My voice changed. Good way or bad way? You're able to hear, Noda? No problem, no. Indirectly, you're telling it's become very harsh. Get out, Suresh Garu. Emaindra, Arthamaindara? Okay, let's see. Suresh is not responding. He's like, your voice changed and he logged off. No, just kidding. Okay, so net profit. Sir, when they say net profit, it means profit after tax. How much is PAT? 30 lakhs. Outstanding preference shares they've given. Sir, in this problem, preference shares is there means preference dividend is there or not there? Obviously, preference dividend exists. There, they have not given. We need to calculate. Okay, how much is preference dividend or maybe calculate of? Preference share capital is 100 lakh. These are 12% preference shares. So, 100 lakh ka 12% if you do, automatically you will get 12 lakhs. Because whether it is Gordon or Walter, I think we need EPS. Especially for last formula, we need a EPS. So, how do you get EPS? Not PAT. Not PAT. Ish. In majority of the problem, preference dividend will not be there. Hence, PAT itself will become ish. But in this problem, preference dividend is missing or there. So, that means you will take profit after tax, reduce preference dividend, you will get ish. Ish divided by number of equity shares. If you do, you will get EPS. That's the first step to do. Tell me how much is EPS in this problem? How much is the EPS in this problem? Where is it? Here only I'll calculate. Okay, 30 lakh is your PAT minus preference dividend is 12 lakh. That becomes your ish divided by number of equity shares, which is 3 lakh. If you do that, how much is your EPS? So EPS is 6 rupees. Earnings per share is 6 rupees. Got it. Okay. Return on investment is given to be R. The R is given to be how much? 20%. Cost of equity is given to be 16%. Okay. Sir, you have to apply Gordon's model and they've given dividend payout ratio. They've given you dividend payout ratio. You have to solve under 3 cases. I think one, if you solve, I think it's good enough. So dividend payout ratio is how much? 20%. Sir, payout ratio is always expressed on EPS. Yes. Sir, how much percentage of EPS are you distributing as dividend? 25%. So 25% of earnings if you're distributing as dividend means balance 75% you are retaining. That means indirectly B in the first case is how much? 75%. In second case, 50% of earning you are distributing as dividend means other 50% you are retaining. So B is 50%. Third case, if you're giving a dividend of 100% means B is 0. In all the cases. That means here they've given B information. So that means we will use what formula? E1 into 1 minus B divided by K minus BR. That information we will do and find out the P naught. Okay, sir? Alright, that's what we have to take it up. That's what I've done here. Check. First, we have to find out EPS as a working note, which we already did and got it to be 6. Then apply the formula. In first case, my dividend payout ratio is 25%. Formula is E1 into 1 minus B divided by K minus BR. Expected earnings. Actually, in this problem, they should have given you expected EPS. Actually, this is not expected EPS. This is actual EPS. That's a typo in question. Let's see when the ICA corrects that. For now, ignore. Maafi. Mother body, maafi. Okay. How much is E, sir? E for EPS here. How much is EPS? 6. Okay. Into 1 minus B. Into 1 minus B. So, in the first case, how much dividend are you paying? 25%. That means how much retention you are doing? 75%. So, B is 0.75. So, EPS is 6 into 1 minus B. B is 0.75. Done, sir. Divided by cost of equity. I think cost of equity is given to us in the question. How much is cost of equity? 16%. So, divided by 16% minus BR. B we already know 0.75. R is given in the question to be 20%, which is 0.2. All the numbers I think are available. Any confusion? No? All okay? So when you do it, you will get the price of the share to be how much? 150. This is the case. Now they've asked same. They've changed the dividend payout ratio. In the second case, instead of 25%, they made dividend payout ratio to be 50%. Okay, maybe one more for the sake of some people are looking at it weirdly. Okay, we'll do one more case. Dividend payout ratio is how much? 50%. Separate case now. Sir, how much is earnings? 6 rupees. Sir, if you're paying 50% of earnings means how much are you retaining? 50%. That means B will be 0.5. Substitute. E is 6 into 1 minus B. B is 0.5. Divided by cost of equity is given in the question to be 16%. Minus BR. B is 0.5. R is given in the question to be 20%. Do this, you'll get how much? 50 rupees. Perfect. Okay, sir. And this also proves also. Why? Sir, R is how much? R is how much? 20%. Cost of equity is how much? 16%. That means which scenario? R is greater than cost of equity. When R is greater than cost of equity, should company pay dividend or they should not pay dividend? When R is greater than cost of equity, optimum dividend payout ratio should be 0. Check here what happened. In the first case, company paid a dividend of how much? 25%. The price of the share became 150. From 25%, they increased and they made the dividend payout ratio to be 50%. Ideally, should you pay dividend or you should not? You should not. Now, company is paying more dividend means share price will increase or decrease? Decrease. See, when you calculated here, it was 150. Now, when you calculated, share price became 50. Next case, when you pay 100% dividend, from 50 share price became 37.5. Ideally, you should not pay dividend. If you're paying more and more dividend means price of the share will go on falling. This is as per your Gordon's model. They did not ask for the analysis, just saying for your reference. None people, they only asked you to calculate the price of the share when dividend payout ratio is these three. Gordon is over also. Carry on. All right. Next we will see what. This is done. Okay. Next one is Graham and Dodd model. Graham and Dodd model. So this is a little bit controversial. I don't know why. The reason I say this is in older version of study material, this was there. We had problems also. In new study material, theory part is cut off. But in MCQ, this still question is there. So I don't know what ICA is trying to say. Okay, so that's the reason I have not removed it. I have kept it as it is. Anyway, simple one. Let's do it off. 2 marker ka MCQ question. Usually all this comes for. So as per Graham and Dodd model, they have done some hypothesis. So as per their hypothesis, price of the share is given by the formula M into D, M, open the bracket, E plus D, or rather D plus E divided by 3. M here for multiplier. What is that multiplier? God knows. Okay, at least I don't know. Are you not writing only? Not? 1 second. Now it writes. Now it writes. Okay. ICA model, Graham and Dodd is given in summary of the chapter. Okay, let it be. Somewhere it is available, no? So we will do it off. M is a multiplier. What is that multiplier? They will give it to you in the question. 5, 4, whatever. Into D. D here stands for dividend per share. Plus E divided by 3. E here stands for EPS. Apply this, you will get the price of the share. If at all they ask, maybe 1 marker or 2 marker MCQ, this particular case may turn up. I don't know whether it will turn up or not. Okay, next is Linter the Sprinter. Okay, sir, Linter, sir, no, is not giving the price of the share. Linter, sir, is not done analysis on the price of the share. Linter's model only gives you a way to calculate D1. D1 means dividend paid or expected dividend. Expected dividend. As per Linter's model, D1 is given by the formula D0 plus EPS into target payout ratio minus D0 into speed of adjustment, or also known as adjustment factor. Okay, so this particular is the formula to calculate D1. It's very simple, just that the formula is made complex. Okay, now what is Linter Circa? Again, the conclusion is, so Linter sir did a survey with various finance managers. So as per this survey, Linter Circa finding was managers, no sir, are hesitant to increase the dividend. Finance managers of a company are not comfortable increasing the dividend. Meaning, if last year suppose finance manager had paid 10 rupees dividend, means next year, no, they are comfortable paying 10 again. If previous year, if they have paid 10 means current year also finance manager are comfortable paying a dividend of 10 rupees. But they are not comfortable increasing. They are not comfortable increasing the dividend. So this particular formula, what it takes is, first you take EPS. Leave this portion, I'll come back to this later. EPS into target payout ratio. Suppose Suppose if your EPS is 10 rupees. Suppose if your EPS is 10 rupees. 1 second. EPS is 10 rupees. Company is planning to give a payout ratio of 40%. Tell me, sir, what you will get? 4. This 4 rupees is dividend already paid or it is target payout? Target payout means it is already paid or expected to be paid. Expected to be paid. That means this particular number gives you what? This gives you D0 or D1. This particular number basically gives you D1. D1. But as per Linter sir's hypothesis, are manager comfortable paying full dividend? See, last year, how much was the dividend? Or let's let's say last year dividend was only 8 rupees. Last year dividend was only 8 rupees. Sir, this year when you no, 8 rupees will be too much as per this calculation. Once again, hang on. How much did you get as per this number? You'll get 10 rupees is the EPS and target payout ratio is 40%, means D1 is how much, sir? 4 rupees. Let's say last year company had paid a dividend of only 3 rupees. Last year company had paid a dividend of 3 rupees. That means compared to last year, company is planning to increase the dividend by how much? 1 rupee. Okay. And as per Linter sir, is company comfortable doing that? No. So you have to multiply by adjustment factor. Adjustment factor is probability percentage. It is a probability percentage. Probability percentage will be given to you in the question. Let's say 40%. They give it as a 40%. What is that is? How much is the increase in dividend? You tell me here. How much is the increase in dividend? 1 rupee. Okay. If they give you probability percentage as 40%, indirectly they're trying to say there is only 40% chance that the company will increase the dividend by 1 rupee. So 1 into 40% is how much? 0.4. Okay, that means the increase in dividend will only happen to the extent of 0.4. Last year, how much dividend company paid? 3 rupees. This year, the dividend will increase only by 0.4. That means the number will become how much? 3.4. Okay, now, just to be on the safer side, I think it's the time talking. You guys are looking at me weirdly. So we'll take up one extra question. So let us say expected EPS is 10 rupees. Expected EPS is 10 rupees. Dividend payout ratio is 80%. Dividend payout ratio is 80%. Okay. D0 is, let us say, 5 rupees. D0 is, let's say, 5 rupees. Adjustment factor is, let's say, 70%. Adjustment factor is 70%. What you have to do simply here is, in Linter sir's formula, you have to first find increase in dividend. You have to find the increase in dividend. Now, for finding increase in dividend, what you have to do? D1 minus D0. D1 minus D0. How do you get increase? How do you get D1, sir? EPS you take, expected EPS you take. How much is expected EPS? 10. Okay. Into payout ratio. How much is the company planning to pay a dividend? 80%. So if you do this, what are you going to get? D1. Yes, people? Okay. We want D1 or we want increase in dividend? If we get increase in dividend, you all have to minus D0. How much is the dividend already paid by the company? 5 rupees. So current year company is planning to pay a dividend of 8 rupees. Last year they paid how much? 5 rupees. So how much dividend company is planning to increase? 3 rupees. Is there a 100% probability that dividend will increase or only 70% probability? So hence what you will do? You will do into 75%. That means into 70%. That is your adjustment factor. Okay, people? Yes. So if you do this, what are you going to get? Tell me. This is 2, or rather the 8 minus 5 is 3. 3 ka 70% is how much? 2.1. That means there is only what, sir? Dividend in the current year will increase only by 2.10. Last year, how much was the dividend? 5 rupees. Hence, D1 is given by the formula D0 plus EPS into, what is this? EPS into target payout ratio minus D0. Okay. If you do this, you will get increase in dividend. Is there a 100% probability that dividend will increase or there is 70% probability? That only we call it as probability percentage. Okay, so when you multiply probability percentage, you will get the dividend will increase in the current year only to the extent of how much? 2.1. So hence, how much will be D1? D1 will be D0 plus 2.1. How much is the dividend already paid? 5 plus 2.1. If you do, you'll automatically get how much? 7.1. So expected dividend is this. Fancy formula. Simply they should have told what? Take D0 plus increase in dividend multiplied by probability factor. It would have become much easier. Chumma they said EPS to target payout ratio minus D0 to speed of adjustment to nonsense. This only it is no. That's all it is. But anyway, they have told, so we have to respect that and write that in examination. But that's what they're trying to essentially do here. Now manageable, comfortable completely. Okay, this is over. Next to this one we already did, so that's okay. Last concept for the day. Dividend discount model. Of late, we have seen this question lately in last 2-3 attempts. Maybe we have seen a lot of RTP, MTP question targeting this particular concept. Maybe ICA ka indirect hint is could be important from this topic. I don't know. Usually, when the question gets seen in a lot of RTPs and MTPs, the usual trend is it is expected in examination. Usually, don't blame me if you don't come. Okay. Alright, don't give me credit if it comes also. Okay. So now they'll ask you to find out something called find out the intrinsic value of the share. They'll ask you to find out the intrinsic value of the share. Sometimes they'll also call it as a dividend discount model. Find out the price of the share using dividend discount model. Like that they will say, or they will say find out the price of the share using intrinsic value. For that, this is the formula. Easy now. That's all it is. Simple. 4 components here, 2 components there, you got the formula. Okay, sir. Actually, no, sir, for this particular model, I don't prefer this formula at all. We don't have to use this formula. Automatically, we can construct. For our time being, we'll ignore this formula, calculate it logically, then we'll look at it as a formula there. I feel that is more better looking at the way they usually ask this question. I'll tell you, I know that I've not reviewed that formula. Give me a minute, I'll come to that. Let's take up this question. I think this is also study material question only if my memory serves right. A&R Limited is a large multinational company. That is their problem. Face value is how much? 100 rupees. Company is expected to grow at 15% for the next 4 years. For the next 4 years, the growth rate is 15%. And thereafter, 5% for infinite or indefinite period. For the first 4 years, the growth rate is 15%. After that, it will grow at 5% for infinity. Okay. Shareholders expect 20% return on their investment. Shareholders ka expected return only we call it as cost of equity. Yes, people. This also we refer to as discount factor. So how much is discount factor or cost of equity here? 20%. Company paid 120 as dividend. So dividend paid is a D1 or D0. Dividend already paid only we call it as a D0. Okay. So they have already paid that much dividend for 2021, that year. The shares of the company are traded at an average price of 312 on the last day. Currently on the stock exchange, the trading price is how much? 3122. This is the share price in the stock exchange. We need to find out the intrinsic value of the shares and state whether the shares is overpriced or underpriced. Share price already given, no sir. No, this is the price in the market. Now, as per our dividend discount model, we have to calculate the price of the share. Compare that price with stock market price. Accordingly, you will get to know shares are at overvalued. Are they overvalued or are they undervalued? That's what we need to calculate. Okay, sir. Very, very simple concept, but formula looks fancy. You will have to find out the price of the share, current price of the share, denoted by the symbol how? P0. Sir, you're finding the price of the share at present value of future cash flows. If you are an equity investor in one company, what is your return? Dividend. And when you sell the shares, you may get some price. That is your return. We just have to find out the present value of that. Now, how to do it? Sir, here dividend are expected. How much dividend you already paid? 120. For first 4 years, how much is your dividend expected to grow? 15%. Okay, so that means first year, how much is your expected dividend? Tell me that. Let's do it. I'll give the call heading. I'll give it later. For first year, you already paid a dividend of 120. For first year, dividend will grow by how much? 15%. That means dividend will become how much? 138. For next year, will the dividend be 138 or again it will increase by 15%? For 4 years, the dividend will increase by 15%. So 138 ka 15% you do. You will get 158. Next year dividend will be 158 ka 15%, which is 182. Next it will be 182 ka 15%, which is 209. After this, dividend will stop or it will go on for infinity. Infinity. That means we can do the calculation only up till 4 years because they have given the data, reasonable data only up till there. Correct? So 4 years dividend you have got. All these are current dividend or future dividend. This is the expected dividend at the end of first year. Okay, this is the expected dividend at the end of second year. This is third year expected dividend. This is fourth year expected dividend. That means all these are on present value terms or future value. Future value. Dividend discount model is trying to find out the value of the share using the present value of future cash flows. So dividend is expressed right now on a future value terms. We have to find out present value. How do you find out present value? Multiplied by discount factor. For that only they have given cost of equity. We read the cost of equity. How much is that? 20%. Okay, so 20% is a discount factor here. Use it. So discount factor, how do you calculate? 1 divided by 1 plus I whole power n. So I here is 20%. So 1 divided by 1.2 you do. You will get first year discount factor 8.833. Go on pressing equals to button for 4 years. You will get the respective years ka discount factor. Correct, sir? How do you get present value? Future value multiplied by discount factor. These two you multiply, you will get present value. Similar, these two multiplication will give you this. So these two you multiply, you will get this. So adding all these are on present value terms. Add all this. How much is that? 432.01. This 432 is future value or present value? Present value. And you are trying to find out the value of the share in future or presently? Presently. So this is one return that you will get as a shareholder by owning equity shares. Any problem? This is the present value of dividend. That's what is my working note. First, you need to find out in dividend discount model, you'll have to find out the present value of dividend. Why did we take only 4 years? Why did we take only 4 years? Because for 4 years, the dividend was expected to grow at 15%. Thereafter, it will go on for an infinity period. Infinity period means how many years you will consider? Don't know. Hence, we stop the calculation at year 4. Okay. And we found out the present value of dividend for 4 years. Easy now. Sir, will you get only for return for equity shareholder is only dividend or also price? Price. Okay. Now, you can do the calculation forever or only for 4 years? 4 years. Yes, no. So, we need to find out the price of the share at the end of 4th year. Because after 4th year, the dividend will go at a infinity growth rate. So, we will not be able to do any calculation. So, we will have to find out the price of the share at the end of 4th year. Sir, you know this already. Tell me, how do you get price of the share? Just now we did. Price of the share. When growth rate is given, which formula uses growth rate? Gordon's. Use Gordon's ka growth model and tell me what is the price of the share, sir? If you want P0 means, you will take what? We'll use a D1. D1 into cost of equity minus growth rate. Correct? Similarly, if you want P1 means you will take, if you want P0 means you will take D1. If you want P1 means you will take D2. D2 into cost of equity minus growth rate. We want P1 or we want P4? If you want P4 means you will take what? D5 divided by K minus growth rate. This is what we'll have to use to find out the price of the share. Got it? I've written it here. Just for your reference, but just saying. So this we'll have to use to get the price of the share at the end of 4th year. Manageable. Okay, sir. Sir, this is the dividend at the end of which year? This is the dividend at the end of 4th year. We want 4th year dividend or 5th year? For 4 years, the dividend will grow by 15%. After 4 years, the dividend ka growth rate is 5%. I am not telling, question. After 4th year, the dividend will grow forever at 5%. That means what will be 5th year dividend? We want 5th year dividend. How do you get 5th year dividend? Take 209.87 and add what? Don't add 15%. Don't add 5% because for after 4 years, the dividend will grow by 5%. Divided by cost of equity. Cost of equity you already took here. How much is cost of equity? 20%. Minus growth rate. Minus growth rate after 4 years. After 4 years, the growth rate will be 15% or 5%. 5%. Do this, you'll get the price of the share. Okay, G. Once more, G. Got it, G. Got it, everybody? Just a pure substitute. If you want, I'll wait for a minute. A plain substitute. That's all. This formula. Instead of for P0, we have to take D1. So for P4, we have to take D5. After 4 years, the growth rate, keep the growth rate in mind. Growth rate will not be 15%. It will be only 5%. You'll have to take 5% as a growth rate and do the calculations here. So when you do it, you got the price of the share. How much? 1469.09. Sir, we are trying to calculate intrinsic value of the share after 4 years or now? No. This 1469 is the price of the share after 4 years. I mean, this is what? Present value or future value? Future value. We have to find out its present value. How do we find out present value? Take the future value and multiply by the discount factor. How much is the price of the share or how much is the future value of the share? 1469.09. Multiply by the discount factor. Okay, which year ka discount factor? This is the price of the share for the 4th year. Is this the price of the share for all the 4 years or 4th year? 4th year. Means will be used for discount factor PVAF or PVIF only? PVIF. Okay, at 20%, because 20% is a discount factor. At 20%, find out PVIF for fourth year, because this is the price of the share for the fourth year. So 20%, at 20%, if you find PVIF for fourth year, how much you get? In fact, you already found out. Why are you doing taka? This one, how much is that? 0.4822. If you do also, you'll get the same number. Yes, no? This is a discount factor. Okay, G. So this is the future value and multiply by the discount factor. How much you going to get? 708. This is the price of the share expected. Sir, is this only return or you have dividend also? Dividend also. How much is the present value of dividend? 432.01. How much is the present value of the share? 708. Add those two, you will get the intrinsic value of the share. Basically, intrinsic value of the share is given by present value of dividend plus present value of the share price. Add the two, how much is it? 1140.405. Okay. So as per our valuation, the price of the share should be 1140. But currently the stock market price of the share is 3122. It is trading at 3122. How much it should be its value? 1140. That means the shares is undervalued or overvalued. Instead of 1140, its value has become 3122. That means this share is overpriced by these two difference. These two difference, if you find, you'll find that overvalued amount. That's what they're asking. Done, sir. Now you tell me, did we use even a single formula? Just it is what, sir? We found out present value of dividend. We found out present value of share price. That is what formula is trying to calculate. Okay. What is that formula now? Simple. Sir, how many years dividend you took? 4 years. Okay. That is what is this formula. Check. This is the formula. D1 intrinsic value. If you don't want to use this method, there is a formula to calculate this. I don't suggest a formula for this. Normal approach is way too easy. But anyways, if you want to use formula, you can use D1 divided by 1 plus cost of equity. Whole power 1. Sir, if you do 1 plus cost of equity is your discount factor here. So essentially what you are doing here, in your denominator, you are doing 1 plus I whole power 1. That means what is this? Discount factor. You are taking first year dividend and multiplying by first year discount factor. That is what we did here. We took first year dividend and multiplied by first year discount factor. We took only 1 year dividend or 4 years That means next will be what, sir? Plus D2 divided by first year discount factor or second year Second year 1 plus cost of equity. N now is not first year. N has now become second year. This is your second year discount factor. You have taken second year dividend and multiplied by second year discount factor. Because to get discount factor, you do 1 divided by 1 plus I whole power n, and I is what here? Cost of equity. That's all it is. Okay. So that's what is the formula is trying to replicate here. So for third year, you take third year dividend and multiply by third year discount factor. You take fourth year dividend and multiply by fourth year discount factor. That is what we did in first table. When you do all this and add, what are you going to get? This particular portion when you do and add, what are you going to get? Present value of expected dividend. That is your working note number 1. So first part of our formula is working note number 1. Okay, G. And then what you have to do? How do you get intrinsic value of the share? Present value of dividend plus present value of share price. Okay. Now you also need to consider share price. So how do you get share price? We want which year dividend growth rate will remain constant till fourth year. That means we want the price of the share for the fourth year. How do you get price of the share? D5 divided by cost of equity minus growth rate. By doing this, you will get price of the share for the fourth year. But are we trying to find out intrinsic value after 4 years or now? Now that means this is the price of the share after fourth year. So can we take this or find out the present value of this? Present value of this. To find out present value, we have to multiply discount factor. How do you get discount factor? 1 divided by cost of equity whole power 4. Why 4? Because we have to use fourth year discount factor, because this is the price of the share after fourth year. This is your formula. Done. By adding these two, you'll get the value of the share. Tell me, you have to really know this formula. Using the normal way is much easier. And why do I prefer than formula for this particular method, the normal working notice? In one paper, I don't remember RTP or previous year paper or whatever, they gave this question. They gave 4 MCQ questions. You know what is that MCQ question? They asked you to find out present value of dividend. Present value of dividend. Now in your formula, this particular portion of your formula gives you present value of dividend. If you use formula, you should remember to know that by adding these 4, you will get present value of dividend. If you don't remember, that whole mark going down. Or if you use a normal problem, you already know working note is nothing but present value of dividend. Put working note number 1, you will get the answer, select the MCQ question. Over. Second MCQ question, they asked price of the share for fourth year. Price of the share after fourth year. In this formula, which captures price of the share? This particular data captures the price of the share. You should know all this. In formula, it is difficult to identify that. So instead of this, directly you can apply this and get the price of the share. And they also asked you what is the present value of the share. How do you get the present value of the share? Take the price of the share and multiply by the discount factor. And then they ask you what is the intrinsic value of the share. So when you do this approach, all this data you'll get individually. So you'll be able to select the right MCQ question. But when you do it as a formula, you should be able to identify which component represents what. First 4 components represents present value of expected dividend. This component represents price of the share after 4th year. This represents your discount factor. By multiplying price of the share with discount factor, you will get price of the share. If you are able to figure out that, apply formula. Otherwise, stick to it. I always suggest this particular method to avoid mistakes. If it comes as a normal question, you can use this or formula, whichever is okay. But by chance, if they ask you MCQ question, I always try to prefer this particular method. Okay, G. Yes, so I think with this, one minute, let me quickly review. Yes, people, with this, all the components which I had to explain under dividend discount model, we have completed. Thank you. Hello, people. So let's continue our revision series. Now we'll be revising working capital management. This particular topic, a big ticket topic. We spent a lot of time in covering this particular topic in our regular class. Now let's try to cover all in about 2.5-3 hours roughly is what I'm estimating to cover this topic by. Okay. All right. So how do you get working capital? Current assets minus current liability. So working capital management means essentially we are managing current assets and we are managing current liabilities. That's all is working capital management ka funda is all about. Okay. All right. Now, sir, as far as working capital goes, you can analyze working capital from 2 angles. You can define working capital from 2 angles or 2 sides. One, you can analyze it from the value angle. From value angle, if you are defining working capital, we call it as gross working capital and net working capital. How do you get working capital again? Current assets minus current liability. Only current asset portion if you take, that we call it as gross working capital. Net working capital means current asset minus current liability. That's how from value angle you can define working capital. Or another side where you can define working capital, that is time angle. From time angle, if you are defining working capital, it is permanent working capital and temporary working capital. Permanent working capital means, sir, you know, some organization will maintain minimum amounts of cash at all times. They'll maintain some 20,000 cash throughout. So that portion, that is temporary or permanent? Permanent. So permanent portion of current assets and all, we call it as permanent working capital. Like per minimum cash maintained, minimum stock level maintained, etc., etc. That we call it as a permanent working capital. Anything which is not permanent working capital becomes temporary working capital. Again, this is not that important, just for a 2-marker MCQ question at best. All right. Now we will dive into the another point. Again, how do you get working capital? Current assets minus current liability. In this topic, essentially what are we doing? Managing current assets with and current liability. Sir, why do we need to manage current assets and current liability? Because it has an impact. What impact? Let's see. So first, let's talk about inventory. Is inventory a part of current assets? Yes, inventory is a part of current assets. Now, why do we need to manage inventory? Let's take a small example. I used to give this example in our regular class if you remember. There is a tomato vendor. Normally, he maintains 50 kgs of tomatoes. Normally, what stock he maintains? 50 kgs. One particular day from 50 kgs, he bought how many kgs? 200 kgs. Instead of maintaining 50 kg stock, he started maintaining 200 kgs of stock. That means inventory level increased. Because inventory level increased, is there any advantage? Yes. What is the advantage? Now, sir, since he is maintaining more stock, he can sell more. If he can sell more, he will get more profit. That is the advantage, right? There are many, 1 or 2. I'm just quickly revising. Yes. At the same time, is there any disadvantage? Is there any disadvantage? Yes. What is that? Sir, if he has bought more means he needs to store more. You need to storage space will increase. Correct? That is one. Second one, funds will get blocked. Earlier, he used to buy, let's say 50 kgs by paying how many rupees? 1000 rupees assumption. Now, to buy 200 kgs of tomato, let's say we need money of 3,500. How much extra money is required? 2,500. That 2,500, the vendor invested now. When will he get it? Only when he sells the tomato. That means by maintaining more stock, the funds get blocked. That is a disadvantage. Okay. Sir, what if he is not able to sell 200 kgs? What will happen? Inventory will get spoiled, right? If this continues for few days or few weeks, will this business survive or it will come to an end? It will come to an end. That means liquidity risk increases. Liquidity means liquidity risk as in the business shutting down risk. So by maintaining high levels of inventory, your business shutting down risk may increase. That is the reason. Can you ignore inventory or you have to carefully manage inventory? Manage inventory. That is your working capital management all about, because there is some advantages and there are some disadvantages. Advantages is by maintaining high inventory, you can make high profit. But disadvantages is your business shutting down risk also will increase. That's the reason we say working capital management is a trade-off. It's a trade-off between liquidity and profitability. We don't want to compromise on the profit, but at the same time, we don't want to take too much of risk. Somehow we have to manage the two. Okay, that's your working capital management of fund all about. Okay, this is about inventory. Similarly, if you want to analyze from debtors angle, let's look at it like this. Let's say earlier, company used to give credit to their debtors to the extent of 30 days. Today, if we sell, means we will recover the money from our debtors within 30 days. From 30 days, company started giving 90 days credit. From 30, credit period was increased to 90. Due to this policy, what will happen? Because you are giving more credit, customers will start buying more. Rather, we will start selling more. If you sell more, you will get higher profit also. So due to this, if your debtor level increases, means your sales and your profit will increase. But at the same time, is there any disadvantages? Yes. So earlier you used to connect the money within how many days? 30 days. Now you are collecting the money within 90 days. That means for how many extra days? 60 extra days, your funds are getting blocked. That's a disadvantage. Okay. And what if the customer does not pay? Bad debts. That means bad debt risk is same here or bad debt risk increased? Bad debt risk increased. If more and more customers becoming bad, what will happen to business? Business shutting down risk will increase. That means due to this policy, liquidity risk also will increase. Okay. So that's the reason we need to carefully manage this particular components. Yes, people. So that is the reason why we say we need to manage working capital. Okay. All right. Next, I'll move on to the next one. Great. Sir, there are about 5 to 6 varieties of problem in this chapter. Usually questions will revolve around that. Okay, 1 or 2 questions I will take for each type and we will take up the concept one by one. Okay, all right. The first type of problems that can be expected from this particular topic is something called calculation of operating cycle. They'll ask you to find something called OC. OC means operating cycle. Sir, operating cycle means what is the operating, what is the nature of any business? If there is a trader, what is the main business of any trader? Buying the goods and selling the goods. Okay. When he purchases the goods, he needs to pay the money. But when he sells the goods, he will recover the money. That is what we mean by operating cycle. That cycle only is what we refer to as operating cycle. Or another way, if you want to define, operating cycle is a time gap or it is a duration. It is a time gap or a duration between the day you purchase the goods and pay the money till the time you sell the goods and recover the money. That particular duration is what we refer to as operating cycle. The day you purchase the goods and pay the money till the time you sell the goods and recover the money. That particular duration is referred to as operating cycle. An operating cycle is given by the formula. Anybody remembers what is that formula? OC is given by R plus W plus F plus D minus C. R for raw material holding period. W for work in progress holding period. F for finished goods holding period. D for debtors collection period. C for creditors credit period. By doing this, you will get it as operating cycle. I had proved all this by putting a timeline example in a regular class. I'll not go into all that, but this is how you will get operating cycle. Find one quick way to get it. Now, let's say we calculated this, we applied this, and we got operating cycle to be 100 days, assumption. We calculated this and we got it to be how much? 100 days. What it means is to run one cycle. Cycle is what? Cycle is what? Buying the goods, selling the goods and recovering the money. That is one cycle. And one cycle takes how many days? 100 days. That means if operating cycle is 100 days, means what is the indication is if you invest the money today in working capital, if you invest the money today, you will recover that working capital within how many days? 100 days. Meaning rather for 100 days, the funds are getting blocked. For 100 days, your funds are getting blocked. Now, can you tell your employees, my funds are getting blocked for 100 days. I will give you salary on the 101st day. 101st day means 3 months, almost 3.5 months. Can you tell your employees 3.5 months once I will pay you salary? They will quit the organization. Yes or no? That means what? If your operating cycle is long, means you may have to take a short-term loan to manage your day-to-day business. So those are all the practical significance of calculating operating cycle. Is this okay with you? Now, this is what we need to calculate in one of the problem. First type of problem. Can we review this? Okay, let's take up the question. 1 minute, let me find that question. This chapter is quite big, so questions are spread across. I've noted it down, I'll tell you. Question number 19 in our class notes. It's a study material question only. I do know in our class notes it is question number 19. Where is it? Here, let's take this. Okay, let's see. Vijay Maliana. Yeah. Okay, bad dates you're talking about. Okay. Sir, following information is forecasted by R Limited as on 31st March 2022. It's okay. If you don't find it, later on you can figure it out. For now, don't waste your time flipping through the pages. Watch the screen. It's okay. Right? So, they have given balance as on 31st March 2022. And also, they have given balance as on 31st March 2021. Sir, 31st March 2022 is our current year balance. 31st March 2021 is our previous year balance. So previous year ka closing balance will become current year ka opening balance. And this is current year ka expected closing balance. That is what they have given. Fine. Now they have given raw material. So what is this? This is the closing balance of raw material, mean this is a closing stock of raw material. What is this? Opening stock of raw material. Similarly, WIP ka closing stock and opening stock they have given. And finished goods ka closing stock and opening stock is given. Similarly, receivable ka they have given closing balance and they have given opening balance. Similarly, payable as in creditor ka closing and opening balance is given in this particular question. Done. Annual purchase of raw material is 400. Annual cost of production is 450. COGS, cost of goods sold, is 525. Annual operating cost is 325. Sales, all the sales annually are made on credit basis to the extent of 585. Okay, this is the data they have given. You need to take 1 year is equal to 365 days. Sometimes in the problem they will say 360. So watch out for that. Okay, here we have to take 1 year is equal to 365 only. You need to calculate number of operating cycle, you need to calculate operating cycle period, number of operating cycles in a year, as well as the working capital requirement. You know how to calculate operating cycle. How do you get that? Raw material holding period plus work in progress holding period plus finished goods plus debtors ka credit period minus creditors ka credit period. Okay. Sir, in some problems, all this data, raw material holding period, like they'll say, on an average, we hold the raw material for 2 months. On an average, we hold working capital stock for 1 month. Like that data will be given to you in the question. If they give you, you can plug in the numbers directly. But in this problem, we read, is raw material holding period, WIP holding period and all given, or we need to calculate? We need to calculate. First, we need to calculate all this number because it is not given to us in the question. Then only we'll be able to calculate operating cycle. That's all is this question all about. Okay, people. Now, how to calculate? Very simple. Check here. First, the raw material. Okay. Now, all these are average, sir. When we say here, it means average. What is this? Raw material holding period. This is the average raw material holding period. Okay. Because you think you apply your common sense. If the company says we hold raw material for 1 month, does it mean only 1 month only, or it's just an average number? Average number. Okay. Or an average overall year data, if you analyze, we hold the stock for 1 month. That's what they are trying to say here. Okay. Now, sir, they have given opening stock of raw material as well as closing stock. We want opening stock, closing stock, or average stock? Average stock. How do you get average stock? Opening plus closing divided by 2. Quickly take your calculator. 65 plus 45 divided by 2. If you do, you'll get 110. 110 divided by 2. How much is average? 55. So average stock is how much? 55. Okay, sir. Sir, oh, all right. This we got it. This is average stock. I've written it. Just one I'll quickly tell you. Other ones we can review. Okay. Now, sir, raw material will the manufacturer sell or he will consume? Raw material manufacturer never sells. He consumes it for producing finished goods. So that means you tell me among all this data, I need what? Do I need annual purchase of raw material? I need annual raw material consumed. I need raw material consumed. So how do you get raw material consumed? Raw material consumed is equal to opening stock of raw material plus purchase of raw material minus closing stock of raw material. Sir, how much is opening stock of raw material? 45 plus purchase of raw material is given over here. How much is that? 400 minus closing stock of raw material is 65. Do this. 45 plus 400 minus 65 if you do. 380. Correct. That is your annual raw material consumed. Because is this what? This is what? This 400 is monthly raw material or annual raw material? Annual raw material. That means this particular 380 is annual raw material consumed. Okay, Saru? Everybody cool? Okay. This is the calculation now. Sir, this 380 is on which platform? Monthly platform or annual platform? 380 is for how many days? 365 days. 365 days. Sir, 380 worth of raw material. All the numbers are in lakhs. Huh? 380 lakh worth of raw material. Are you holding it as closing stock or what is your average stock? Your average stock is only 55. Sir, if 380 represents 365 days ka stock, means 55 represents how many days ka stock? Like this we have to calculate. Understood everybody? Fine. Once more, 380 is your annual raw material consumed. Annual means this 380 is for 365 days. Are we holding 380 lakh closing stock of raw material or only 55? We are holding only 55 lakh worth of raw material. 55 represents how many days ka stocks? Quickly do that. Cross multiply. How much is that? 55 into 365 divided by 380. If you do, how much you going to get? You can round off and tell me. How much is that? 52. So I'll take it as 53 days. Is it okay with you? So that means what, sir? Average raw material ka holding period is 53 days. Like this, we'll have to calculate. Are we calculated? No. Like this, we'll have to calculate W, F, D, and C as well. Then we'll be able to calculate OC. Manageable, everybody? Okay, keep your calculator. Quickly, we'll go on reviewing it. Okay, next. Next is for work in progress. First, you need to find out what, sir? Work in progress ka average stock. Find first average for me. 51 plus 35 divided by 2, you do. Quickly. 43 is your average work in progress. Okay, work in progress is associated with what? Cost of production. Cost of production. So how much is the cost of production? 450. That means 450 is how many days ka stock? 365. What is the average WIP ka stock? 43. 43 represents how many days ka stock? Calculate that. 450 represents 365 means 43 represents how many days ka? X is how much? 35 days. So that means average work in progress ka holding period is 35. Like this. One by one we have to calculate. Yes, sir. Done. Okay, this is over. Next is what? Finished goods. First find average finished goods. 70 plus 60 is 130. 130 divided by 2. How much is average? 65. Average stock of finished goods is 65. Finished goods ultimately what you will do? You will sell. Right? Finished goods you will ultimately sell. What is your annual cost of the goods sold? 525. 525 is 1 day ka or 365 ka? 365 ka. What is the average stock of finished goods? 65. 65 represents how many days ka stock? Prorated. If you prorate it, how much you going to get? 45. So that means average holding period of finished goods is how much? Average closing stock of holding period of finished goods is 45 days. So R over, W over, F over. Only two more components. What is that? D and C. Okay, D and C, let's calculate. D for what? Debtors ka collection period. So debtors will come relating to the purchase or production or COG. What is that? Debtors will come with respect to annual sales. Yes, no, annual credit sales. Sir, how much is your annual credit sales? 585. 585 is 1 day ka sale or whole year ka? 365 ka. First find average debtors. How much is average debtors? 135 plus 112 divided by 2 you do. 120? 123, yeah. 123.5. Okay, that means I'll write it as 124. Okay, fine, 124. So, 585 is for 365 means 124 represents how many days ka debtors. If you calculate it, how much you going to get? So, my calculator is showing 77. You also got 77 days. That's all it is. Fine. Okay, next we need C. C for what? C for creditors payment period. Okay, creditors will come with respect to raw material consumed or raw material purchased. Raw material purchased. How much is raw material purchased? Raw material purchased is 400. 400 is what? 1 day ka raw material purchased or whole year ka? Whole year. That means 400 is for 365. What is your average creditor balance? 71 plus 68 divided by 2 you do. These two are division. 69.5. So I'll take it as 70. Okay. 400 represents 365 means 70 represents how many days? How much is that? 60? 64 days is your, or I've taken 63 or 64 or whatever is your creditors ka payment period. So you got all the numbers. Now how do you get OC, sir? How do you get OC? R plus W plus F plus D minus C. Plug all that number, you'll get operating cycle. How much? 147 days. This is the first requirement of the question. Find out operating cycle. If operating cycle is 147, what it means? For 147 days, our funds are getting blocked. To run one cycle, how many days we need? 147. Okay. Next requirement of the question is find out the number of operating cycles in a year. To run one cycle, we need how many days? 147. How many days are there in a year? 365. To run one cycle, it takes 147, and in a year, there are 365 days. Means how many cycles can you run in a year? 365 divided by 147. Or if you want it in a formula, that will be number of days in a year divided by operating cycle. If you do that, how much you going to get? 2.48. So in a year, you can run the cycle 2.48 times. That's all it is. That is the second requirement. Easy. Third requirement, they ask amount of working capital. Amount of working capital they're asking. Sir, okay, check the question, sir. How much is your annual operating cost? Annual operating cost is your day-to-day expenses. How much you need for your day-to-day expense? 325. This is everyday or total? Annual. Okay. On an average, annually you need for operating cost, how much money? 325 lakhs. 325 lakhs. Okay. Now they're asking how much working capital you need to maintain. Sir, working capital is given by this particular formula. Annual operating cost divided by number of operating cycles in a year. What is annual operating cost? 325. In a year, how many cycles can you run? 2.48. Do that. That means how much is it? 131.04. Or in another way, sir, this 325 is for what? 1 day ka or whole year ka? Whole year. And for the whole year, how many cycles can you run? 2.48. That means this 325 lakh is an expenditure for 2.48 cycle. For one cycle, how much is the expenditure? On an average. Like that's what we are trying to calculate. How much is that? 131.04. That much working capital you need to maintain in your books. If you don't have the money, take working capital loan or a short-term loan to manage your day-to-day business. This is what it is. This is one way of calculating working capital through your operating cycle method. First kind of problem, Damar. Okay, ji. 1 over another 5 or 6. That's it. That means early today, yes, sir? No. It will take time. Some are small, some are big. Okay. Yeah, this is okay. You are through, you said. I'll come back to the chart. Where is it? Here, this is okay, over, this is over. All right, let's move into the second type of question. Second type of question is estimating the working capital. Estimating working capital. So, how do you get working capital? Current assets minus current liability. Okay. In this problem, we have to find out the working capital, not through operating cycle method. We'll have to estimate the working capital. Means we have to estimate all the components of current assets. We have to estimate all the components of current liabilities. What are some of the examples of current assets? Tell me. In closing stock of raw material, closing stock of WIP, closing stock of finished goods, debtors, prepaid expenses. Some of the cash. Some of the examples of current liabilities are creditors, outstanding expense, etc., etc. All that we need to estimate. Every component of current asset and every component of current liability we need to estimate. And how do you get working capital? Current assets minus current liability. That is the next sort of problem. Okay. Usually if they want to ask more than 7 marks, 8 mark question, usually they pick this particular type of question from this chapter for more than 7 marks. Okay. We'll see how this particular funda works. Okay. For that, first we have made a small format. Okay, in fact, smaller, quite big only. All right. And if you remember, for this type of question, we had solved more than 8 to 9 questions in our regular class. Okay. And same followed, more or less, I had followed for almost every question. Okay. Now, what is this format? First one is we'll have to find something called work in progress ka closing stock. First working note here is it's not, sir, you have to do it in this format only. In a regular class, I had stuck to this format. Hence, I'm revising through the same format. Okay. You can change the order. That's absolutely okay. All right. Okay. First one is we'll have to find out WIP ka closing stock. Sir, work in progress means what? Work in progress means it is neither raw material, it is neither finished goods. It is stuck somewhere in between. Like obviously you people. Neither you know the syllabus fully, nor you don't know the syllabus completely also. Somewhere you are stuck in between. That is what we refer to as work in progress. Okay, so now first working note, sir, we'll hit you, sir. No, just telling reality, that's all. Okay, work in progress ka Closing stock is what we are trying to find out in the first step. Okay. All right. Work in progress. What they will tell you is there are two ways through which they can ask this. One, I will do it. I mean, in the format where I'll discuss one. When I take up the question, I'll take both the types of questions so that you will get to know how the structuring of the question happens. Okay. First one is, sir, work in progress means is it fully complete? Is that product fully complete or it's somewhere in between? Maybe it is 40% complete, 20% complete, or 80% complete. I don't know. Correct. So that means to find out work in progress, first you should insert material. First we should insert material. Correct. So you need to incur. Have you incurred any material cost for WIP? Yes. Because unless you insert material, can you start your production? No. So first you will take materials. So what you will do is they will give you in the question annual raw material consumed. They will give you raw material consumed, but they will give it to you on an annual basis. Okay. Annual basis means this is for 1 day or whole year. Whole year. Sometimes they will give you the data in months. If they give you in the months, you will divide by 12. If they give you the data in days, you will divide by 12. If you 365, if they give you the data in weeks, you will divide by 52. Problem to problem, this will keep changing. Okay. So since they are giving you annual raw material consumed, we don't want annual raw material consumed. They will tell you in the problem like this, work in progress ka holding period is, let's say, 1 month. On an average, work in progress ka stock is maintained for 1 month. Okay. This particular component, annual raw material consumed, is it for 1 month or it is for 12 months? 12 months. Just for 12 months. That means you will take annual raw material consumed and divide by 12. That means what do you need? You need 12 months ka stock or 1 month ka? That you will multiply. What is that one? That one is nothing but WIP ka holding period. In my example, that is how much? 1 month. In the another problem, they make, instead of 1, they can make it as 0.5, or they can make it as 2 months, or they can give it in days. So first you'll have to do that. Annual raw material consumed divided by 12, 365 or 52 depending on the data, multiplied by work in progress holding period. Okay, sir? Yes, everybody? Sir, work in progress means, is it necessary 100% of the material should be inserted, or you can insert it in stages also? Stages also. So that means you need to multiply by the DOC. DOC as in degree of completion. Okay, this will be given to you in the question. What is degree of completion? Degree of completion means how much material or how much work in progress is complete. Whether it is 10% complete or 40% or 80%, it will be mentioned to you in the question. Sir, in case they have not given DOC information, if DOC is missing, as a convention, no logic, just as a convention, for material we assume for DOC to be 100%. For others, we assume the DOC to be 50%. No logic, just a convention. Okay, you will do this only if the question is silent. If they give you DOC percent, take that. If it is not mentioned, take this as the degree of completion. Okay, people? This is first. Sir, work in progress means you will incur only material cost or even other cost also. Other cost also. Sir, to produce finished goods, we need material and we need what? Labor also. So next you will take the labor cost. In the question, they will not give you 1 month ka 1 day ka labor cost. They will usually give you annual. Total annual labor cost they will give you. Annual labor cost means this is for 1 day or whole year? Whole year. So divide by 12. We want whole year ka or we want WIP holding period ka? What is WIP holding period in my example? 1 month. So you will multiply by 1 month or you will multiply by WIP ka holding period, whatever it is. Fine, people? But do not forget to multiply DOC. Because WIP means 100% complete? No. It could be whatever percentage complete. It will be given to you in the question multiplied by DOC. Okay, Saru? Sir, to produce finished goods, do you need only materials, labor cost or even other overheads also? You may have some other manufacturing overheads also. So take that. They will again give this overheads information on an annual basis. That means you will divide by 12 and multiplied by what? WIP ka holding period multiplied again by DOC. Doing this, if you add all this, you will get total WIP ka closing stock. This is what you do. Okay, this is one kind of question they will give you. Once 5-10 minutes, quickly I'll review the format. Then we will take 2 questions to revise this format once again. Okay, that should give you a fair idea about it.
So we have to add all these 3.
Yes, you have to add all the 3. Okay, these 2 we call it as conversion cost. Labor and overheads we call it as a conversion cost. Sometimes they will say DOC for conversion cost is 50%. DOC for conversion cost. That means degree of completion for direct labor and overhead is 50%. So instead of giving individually, they may give you directly conversion cost also. That way also sometimes question gets structured. Okay, by adding all the 3, you will get closing stock of WIP. Can I move on to the next working note? Okay, second working note, we prepare to get the debtors. Second working note we prepare to get the debtors. Sir, this is your cost sheet format. Anyway, costing is done, right? We use cost sheet format, but we don't use total cost approach. We use cash cost approach to find the debtors here. Cash cost means, what's the difference between total cost and cash cost? In total cost, even non-cash expenditures like depreciation will be considered. In cash cost approach, we only take the cash cost. Non-cash expenditures like depreciation, amortization and all we will not consider. If the question is silent, always work out the problem under cash cost basis. Okay, fine, because working capital means, operating cycle means, just now we discussed, what is that? Number of days. If operating cycle is 100 means, what does it mean? For 100 days, the funds are getting blocked. For depreciation, fund will get blocked up. Due to depreciation, cash will go out. No. So we want to find out how much cash is getting, how much money is getting blocked. Hence, better approach to find out working capital is on a cash cost basis. If the question says total cost, do it on that. Otherwise, you always prefer the cash cost basis. Okay. This is a cost sheet format. You don't have to bring in full cost sheet format because this is just a working note to find out debtors. So first, we will take your material consume. Material consume. To that, you add your labor cost and you add your overhead cost. I don't want prime cost and all. Directly, I'll add all this overhead and directly get the factory cost. But keep in mind, the overhead should include depreciation or exclude. Exclude. Why? We are preparing this data on a cash cost basis and not on total cost. If you are doing it on total cost, will you exclude depreciation or include? Include. That like that. Okay. So adding material consumed and labor cost and overhead cost, manufacturing overhead cost, you will get factory cost. From factory overhead cost, what do you add? Opening stock of WIP. Reduce the closing stock of WIP. You will get the cost of production. To the cost of production, add administrative expenses, add opening stock of finished goods, closing stock of finished goods, you reduce, you will get cost of the goods sold. To COGS, if you add, this is a cost sheet format, yes, no, everybody. To COGS, if you add selling expense, you will get what, sir? Annual cost of sales. Annual cost of or cost of sales. Yes. Okay. Now, 1 second, stop. Will you get debtors relating to total sales or credit sales? Credit sales. In majority of our problem, total sales and credit sales will be same. But in some problems where we have seen, they say out of the total sales, 20% is cash sale. That means what? Only 80% is credit sales. We are trying to work out what here? Are we preparing cost sheet or are we working out debtors? Debtors. That means, do we want cost of sale or we want what, sir? Cash cost of. We need credit sales. We don't want cost of sale. We want cost of credit sales. If the information is given, find out that. Otherwise, assume that the cost of sale and cost of credit sales are same. Everybody cool? Okay. So take this information, then you find out the debtors. Okay. Suppose if this data is suppose 10 lakh. If this data is 10 lakh, what it means? Cash cost of credit sale is how much? 10 lakh. So that means the 10 lakh is for 1 day or whole year? That means this is for how many days? 365 days. Sir, do you give debtors a credit period of 365 days? Whole year credit will you give it to your customers? No, in the question they may say that on an average we give 40 days credit to the debtors. They will mention. I mean, this particular 10 lakh is for how many days? 365 days. But are you giving 365 days credit to your customers or only 40 days? For 40 days, if you're giving number means how much is it? Calculate X for me. How do you get X here? 10 lakh into 40 divided by 365. In fact, number I don't want. 1 minute. Hang on. Tell me this in formula. This particular thing, tell me in formula. What is this 10 lakh? Annual cash cost of credit sales divided by 365 multiplied by 40. What is that 40? Debtors ka collection. Doing this, you will get the debtors ka value. Done, people. That's how you find out the debtors. Done, ji. Sir, but debtors will come with respect to credit sales, no, sir. Why are you taking cost of sales, sir? We should not take cost of sales, sir. We should actually take sales. We should actually take sales. But here I'm taking sales or cost of sales. I'm taking cost of credit sales. I'm not taking credit sales. I'm taking cost of credit sales. But ideally, debtors will come from what? By selling the goods. I mean, should you find debtors using cost of credit sales or actually credit sales? Credit sales. But 1 second, hang on. We are trying to find working capital estimate. Working capital estimate means for how many days the funds are getting blocked. Sir, fund will get blocked to the extent of selling price or cost price? Cost price. Because to sell the goods to the debtors, first you need to buy. Will you buy it at selling price or cost price? When you buy the goods, you will pay the money to the extent of cost. Hence, debtors ka estimate is done using the cost of sales here and not the selling price, because selling price includes profit. When you buy the goods, will you pay profit? No. You will buy the goods at what price? Cost price. So funds are getting blocked to the extent of cost. Hence, we use cost of credit sale data to find out debtors. Then, and not credit sale. Hope this is clear for everybody. This is your working note number 2. Ditto will apply it in the next problem. Don't worry. Okay, sir. Okay, third one is to find out the creditors. Even online also everybody are there till here. No worries. Able to recall, especially our regular students. You should tell, yes, pa, I've done, I think, more than 10 questions. In fact, whole day we have spent only for this concept alone. Almost, yeah. More than one day, I think. I don't remember. Anyways, okay. Next one is, next working note is to find out the creditors. Now you tell me, sir, creditors will come with respect to raw material consumed or raw material purchased? Creditors is linked with raw material consumed or raw material purchased? Raw material purchased. That means, can we use this information and find creditors? No. We don't need raw material consumed. We want annual raw material purchased. Sir, how do you get raw material consumed? Tell me. How do you get raw material consumed? Raw material consumed is given by the formula opening stock plus opening stock of raw material plus purchase of raw material minus closing stock of raw material. Sir, if I give you raw material consumed, if I give you opening stock and if I give you closing stock of raw material, can you find out purchase of raw material? Yes. Rephrase that equation for me. How do you get purchase of raw material? You will take raw material, consume. Closing stock, you send it to the other side. So it will become negative, will become positive. Opening stock, you will send it to the other side. So positive will become negative. Tell me the equation to find out purchase of raw material. Raw material consumed plus closing stock of raw material minus opening stock of raw material. If you do that, you will get annual purchase cost of raw material. Suppose this was where it went. This is, let's say, 10 lakh rupees. This is 10 lakh rupees. I mean, this 10 lakh rupees is for what, sir? This is what? Annual purchase cost of raw material. I mean, this 10 lakh is a cost for 1 day or 365 days? 365 days. Will your creditor give you 365 days credit? Will, if you purchase raw material from our creditors, will we get 365 days credit? No. He may give you 30, 40 or whatever. Let's say creditor gives 50 days credit. Creditor gives 50 days credit. Somewhere it went only. This option, I don't know. Something happened here. What happened? Okay. Are you pen only going there? Okay. Oh, 10 lakh represents how many days stock? 365. Creditor, let's say, has given a credit period of 30 days. 30 days represents how many days? You need to prorate like this. How do you calculate this now? 10 lakh into 30 divided by 365. Now express this in formula for me. Tell me this in formula. What is this 10 lakh? This 10 lakh is what? Annual credit purchases divided by 365 multiplied by 30. What is that 30? Creditors ka credit period. By doing this, you will get the value of your creditors. That's all. Rest of the data, they will be given to you in the question. These three usually you'll have to estimate. Rest other things will be manageable. You can figure it out. Okay. Then you will have to prepare one statement to find out what's our working capital estimate. Okay. Now, how do you get working capital estimates? Current assets minus current liability. What are the components of current assets? Closing stock of raw material, closing stock of WIP, closing stock of finished goods, debtors. And then prepaid expense, if at all it is there, they will give it to you in the question. Cash data will be provided to you in the question. Adding all this, you will get what? Total current assets. Then current liabilities. One form of current liability is creditor, which we found out in working note number 3. Outstanding expenses may be there depending on the question. Adding these two, you will get total current liabilities. From current assets, if you reduce current liability, you will get net working capital. Sometimes they will tell in the problem, sir, all these are pakka number or estimate. These are all whatever we found out here, current assets, current liability, pakka number or estimates. Estimates. Our estimate should be perfect, pakka, or it can be little wrong also. Hence, in the problem, they will say add 10% safety margin. Add 15% safety margin. So to whatever number you have estimated, suppose you got this to be 10 lakh. To 10 lakh, if safety margin is 10%, means you will add 10% and make the working capital to be 11 lakh. Safety margin or contingency may be there in the question. It may not be there. If it is there, they will mention what is that safety margin ka percentage. Okay. This is your working capital ka estimate wala problem. Now, can we review this in the one question now, everybody? Paka, okay, cool. All right, let's 1 minute do a thing. Let's review this. Let's try to recollect this format, then try to will apply it. Okay, first working notice for what, sir? WIP. Work in progress ka closing stock we have to find. For that, first we need to take raw material. So how do you get raw material cost with respect to WIP? First you will take annual raw material consumed divided by 12, 365 or 52 multiplied by work in progress ka holding period multiplied by DOC. DOC as in degree of completion. Then for work in progress, you will only incur material cost or even conversion cost. Conversion cost is of two types, labors and overheads. So you will take labor cost related to WIP. First you will take annual labor cost divided by 365, 52 or 12 depending on the data multiplied by WIP holding period multiplied by DOC. Okay, next overhead cost. You will take the annual overhead cost divided by 365, 52 or 12 multiplied by WIP holding period multiplied by DOC. Adding all this, you will get closing stock of WIP. Working note number 1 over. Next, working note number 2 is done to find out debtors. We use cost sheet ka format here. First, you will take annual raw material consumed. Then add labor cost on an annual basis. Then overhead cost, total overhead cost you add. Adding all this, you will get factory cost. To factory cost, add opening stock of WIP. Reduce closing stock of WIP. You will get the cost of production. The cost of production, you add your admin expense, excuse me, plus opening stock of finished goods you add, closing stock of finished goods you reduce, you will get COGS, cost of the goods sold. To that you add selling expense, you will get cost of sales. We don't want cost of sale, we want cost of credit sales. Okay, find out cost of credit sales. Using this, we'll find out debtors. Debtors is given by the formula annual cash cost of credit sales divided by 12, 365 or 52 multiplied by the debtors ka collection period. Debtors got it. Third one is to find out creditors. For creditors, we don't want raw material consumed. We want raw material purchased. First, we need to find out annual raw material purchased. That is given by annual raw material consumed plus closing stock of raw material minus opening stock of raw material. That way you will get annual raw material purchased. Using this information, we'll find out creditors. Creditors is given by annual raw material purchased divided by 12, 365, 52 multiplied by creditors ka payment period. Take all this number, dump it into the format, question over. Okay, sir. Can we review one question quickly now? Okay, where question? No. Question number 3. In our class notes, it's there in study material also here. Okay, review this. Sir, what if suggested answer and our answer is estimated? Sir, that and all not possible. Your answer in a suggested answer and our answer should match. If it doesn't match, means come again and match it in the next attempt. Yeah, they will not allow you to pass. Okay, all right. So on 1st January, managing director of one company, Naureen Limited, they want to know the amount of working capital required. You need to prepare basically working capital forecast. You have to estimate basically working capital. Okay, ji. Pay attention to this. Production during the current year was 60,000 units. Okay. It was planned that this level of activity would be maintained during the present year. The expected ratio of cost to the selling price is as follows. Raw material is 60%. What does it mean? The estimated ratio of cost to the selling price. That means indirectly they're telling raw material constitutes 60% of the selling price. Wages constitutes 10% of the selling price. Here they have given you selling price. Check. Selling price is how much? 5 rupees per unit. That means what will be raw material cost per unit? 60%. If selling price is 5 rupees per unit, means raw material cost will be 5 ka 60%, which is 3 rupees per unit. Similarly, direct wages will be 10%. 10% of the selling price, which is 0.5 per unit. And overhead cost is 20%. So 5 ka 20% is 1 rupee per unit. That's what they have given. Alright, G. Raw material are expected to be maintained in store for an average of 2 months. That means raw material holding period is 2 months before issue to production. Each unit is expected to be in process. In process means work in progress or WIP. WIP ka holding period is how much? That process period is 1 month. Okay, it could be 1, 2, whatever, depending on the question. In this question, WIP ka holding period is 1 month. Raw material being fed into the pipeline immediately. To start, usually, sir, to start the process, first you'll have to insert the raw material. I mean, they're saying the raw materials are fed into pipeline immediately, means indirectly they're telling DOC for raw material is degree of completion of raw material is 100%. Because all the raw material you insert immediately, then only you start the production. You're not inserting the raw material in stages. But any which way, we also know the logic. I mean, we also know the funda. What is that? If DOC is not given, for raw material we take it to be 100%. For others we take it to be 50%. Like that also you can derive. Labor and overhead cost accrues evenly during a month. That's fine. DOC of labor and overhead given or not given so far? Not silent. That means we will take it to be 50%. Okay. Finished goods will stay in the warehouse for approximately how many months? 3 months. So finished goods ka holding period is 3 months. Credit allowed by creditor is 2 months. For debtors we will give how many months credit? 3 months. Selling price is 5. Okay. Wages and overhead cost are paid of the first of each month for the previous month. Sir, previous month's ka wages do you pay in the previous months only or in the next month ka first day? Next month. That means can I say 1 month of wages is outstanding? Because March month ka wages, will you pay it in March or 1st April? 1st April. That means in the month of March, wages is settled or outstanding? Outstanding. That means indirectly they're telling wages cost is outstanding for 1 month. Only wages or even overheads? Overhead cost also is also outstanding for 1 month. That's what they've given. Now, company normally keeps a cash of 20,000. Cash is already given. Safety margin given or not given? If they don't give, you don't add your own safety margin. If it is given, take, otherwise leave. So, can we start? Okay. First working note is what again? WIP. Okay. Now, how do you get WIP? First for what, sir? Quickly tell. We need towards raw material. Do you know annual raw material consumed? Yes. Sir, annually how much have you produced? 60,000. What is the cost of 1 unit of raw material?
3 rupees.
3 rupees. So calculate. 60 into 3 is how much? 1,80,000. That's what I've done here. 60,000 is the number of units of production. Selling price is 5, but raw material cost is 60% of selling price. 5 ka 60% if you do, automatically you will get what? 3. So annual raw material consumed is how much? 1,80,000. Correct, people? Yes. But this 1,80,000 is for 1 day or whole year? Here. Now we read the data. Here the data was given in days, weeks or months? Months. That means we'll divide by what? 12. Okay. Multiplied by WIP holding period. What was the WIP holding period we read the question? 1 month. Right? So into 1 month you'll do. Multiplied by DOC. What is the DOC for raw material? 100%. So multiply this, you will get towards your WIP material cost you've incurred on an average to the extent of 15,000. Yes, people? That's all or next? What is the next one? Labor. Okay. Sir, how many units have we produced in the current year? 60,000. What is the selling price of each unit? 5. Sir, they told in the problem 10% of selling price is your labor cost. So 5 ka 10% if you do, you will get labor cost of 0.5 per unit. For 1 unit it is 0.5. For 60,000 how much it will be? 30,000. Correct? But the 30,000 is for 1 day or whole year? Whole year. That means you will divide by 12. Multiplied by WIP holding period. How much is WIP ka holding period? 1 month. Multiplied by DOC. DOC given or missing? Missing means you will take it as, this is a conversion cost. For conversion cost, DOC will be taken as 50%. Do that, you will get 125, sir. All of you are calculating and getting that same number?
Yes, sir.
Correct? Okay, next is what, sir? Overheads. So how many units have you produced? 60,000. What is the overhead cost per unit? 5 rupees ka 20%, which is how much? 1. For one unit, it is 1 rupee. For 60,000, how much it will be? 60,000. 60,000 is for the whole year. That means you will divide by 12. Multiplied by WIP holding period. How much is WIP holding period? 1. Multiplied by DOC. What is the DOC for overheads? 50%. Do that, you will get how much? 2,500. Adding all the three, you will get closing stock of WIP to be how much? 18,750. One working note. Tomorrow. So far easy. Can I move on to the next working note? Okay, working note number 2, you guide me. What is working note number 2 for? Debtors. Okay, for debtors, first we will start with what? Annual raw material consumed. Okay. Sir, what is the raw material cost per unit? 3 rupees. How many units have you produced? 60,000. That means annual raw material consumed is how much? 1,80,000. Yes. Okay. Then annual labor cost. Sir, totally you produce 60,000 units. What is the labor cost per unit? 5 ka 10%, which is 0.5. 0.5 into 60,000 if you do, total labor cost is 30,000. Okay, sir. Similarly, overheads. 60,000 units you have produced and the overhead cost per unit is 5 ka 20%, which is 1. For 1 unit, overhead cost is 1 rupee. For 60,000 units, it will be 60,000. Adding all this, you will get the factory cost. How much? 2,70,000. Next, tell me, after factory cost, what you will do? Add opening stock of WIP minus closing stock of WIP. Sir, closing stock of WIP, you already got it. How much is that? 18,750. That you will minus. Correct? And one more point you need to keep in mind when you are estimating working capital problem is you should always check whether the company is an existing company or a new company. Whether the company is a existing company or a new company. Sir, if it's a newly started business, will they have opening stock? No. If it's a newly started business, means there will be no opening stock of raw material, no opening stock of WIP, no opening stock of finished goods. Now come back to this question. Have they told anywhere that this is a newly appointed company? Is a newly appointed company mentioned? No. I mean, this is what sort of a company? Existing company. For existing company, if they don't give the data, we assume closing stock and opening stock are same. Opening stock, because every year ka production cycle, we assume it to be same. If last year you produced 60,000 means current year also we expect you to produce 60,000. So same data will be assumed. So how much is closing stock of WIP here? 18,750. So opening stock also we'll assume it to be same. Okay. Or if you want one shortcut method, should you have to bring this in the format or you can cut it off? Cut it off. Why? Because 18,750 you are adding, same 1850 you are minusing. So if you feel you want to save some time, cut off this data. But when can you cut off this data? When can you cut off this data? Only when it is a existing company. Because existing company ka opening stock and closing stock, we assume it to be same. That is the reason. If it's a new company means, can you cut it off or compulsorily bring? Bring. Why? For a new company, opening stock will always be 0. Closing stock will be there. Okay. So only if it's an existing company, you have a choice to cut off this. That is your choice. I made it as a format in class, so I did not cut off. In exam, you have that scope to cut off and save 1 or 2 extra minutes. Done, people? Yes, so from factory cost, if you add opening stock of WIP and reduce closing stock of WIP, you will get cost of production. We read the data. Do we have any admin expense? No. To that, we will add what, sir? Opening stock of finished goods and reduce closing stock of finished goods. Now, finished goods, how to find? Simple. Sir, finished goods anyway? Yes, magic. Sir, how much finished goods means? Finished goods means it is fully complete. It is fully complete. That means cost of production. Cost of production is for fully completed goods. Yes, sir. Correct. So 2,70,000 is the total cost to produce the finished goods. 2,70,000 is the total cost you have incurred in the current year to produce finished goods for 1 day or whole year. I mean, this 2,70,000 is a cost for 1 day or annual cost of production. Annual. So 2,70,000 is a cost to produce for the whole year, means it is for 12 months. It is for 12 months. Sir, entire goods, whatever you produced, entire thing you will hold it as finished goods ka closing stock or on few. If you produced 2,70,000 worth of finished goods in the current year, entire 270 worth of goods, will you hold it as closing stock or some? Some may be already sold also, no? Right? They gave you in the question, what is finished goods ka stock holding period? Check. Finished goods on an average will stay in the warehouse for 3 months. So 2,70,000 is the cost to produce for the whole year. Meaning 2,70,000 is for how many months? 2,70,000 is for, or maybe I'll write it here. 2,70,000 is for 12 months. Yes, correct. But have you, but how much do you have? How much on an average you will maintain finished goods ka stock for? 3 months. For 3 months, how much is it? You need to prorate and do it. That's all it is. Understood, everybody? So when you multiply, what it will be? 2,70,000 divided by 12 into 3 if you do, you will get how much? 67,500. That is your closing stock of finished goods. Once more or okay? Once more or okay? Okay. Sir, it's an existing company. So if closing stock is 67 means opening stock also will be 67. I mean, this data also, you should bring it in the format or not required? Not required. Is it okay? But anyway, you need this data for final statement. So that way, any which way you have to calculate it. But bringing or not bringing is your choice. Okay. So by doing this, you'll get the cost of the goods sold. How much is it? 270. We read the question. Is there any selling expense? No. That means you will get cost of sales. Cost of sales. Annual cash cost of sales. Correct. But we want annual cash cost of sale or annual cash cost of credit sale. Cash cost of credit sale. We read the problem. Have they told only 80% of the sale is on credit basis or only 90% is on credit sales? Like that, have they mentioned or no mention? Nothing is mentioned means what is the assumption? All the sales are made on a credit basis. That means if cash cost of sale is 270 means cash cost of credit sale is also 2,70,000 itself. Done, people? Now using this, what we will find? Using this, what we will find? Debtors. How do you find debtors? 2,70,000 is for 1 day or whole year? Whole year. That means you will take what, sir? Take in a calculator. 2,70,000 divided by 12. Divided by 12. Sir, will you get 12 months credit from your debtors, or debtors ka credit period is how much? Debtors ka credit period given in the question is only 3 months. So into 3 you do. Into 3 if you do, what is your number showing in your calculator? 67,500. Okay, sir. This is your cash cost, sir. We don't have to find cash cost. Okay. This is the cash cost. All these costs are on a cash cost basis only. This is the things. All right. So in some problem, they will say like this: overheads include here, or maybe one doubt I've got it. Sir, what is the overhead cost? 5 rupees is the selling price. What is the overhead cost per unit? 20%. That means how much is it per unit? 1 rupee. In some problems, they will say, okay, this 1 rupee includes depreciation of 20 paisa. It includes depreciation of 20 paisa. That means 1 rupees is the total overhead cost. You want total overhead cost or cash overheads? So in this case, you'll have to minus this and get it as 0.8 per unit, like that. But in this problem, have they told it includes depreciation and all? That means we don't have to do this drama. But in some problems, this is given. We have solved such question also. It was there. Done, people? Okay, this is done. So how much is your value of debtors? Hope Loteshwar Macha, you got it, Dada? Can I move forward? Okay, debtors ka value, you got it. Working note number 2 fully over. Working note number 3, Chapande. And now, creditors. Creditors, how do you get? For creditors, we need raw material consumed or raw material purchased? Raw material purchased. How do you get that? Take annual raw material consumed. How much is raw material consumed for the whole year? 1,80,000. You already found out in working note number 2 only. Okay, annual raw material consumed is how much? 1,80,000. To this, you add a closing stock of raw material. You add opening stock of raw material, you minus. Okay, ji? Okay, now check. Sir, this 1,80,000 is what? Annual raw material consumed. That means this 1,80,000 is for 1 day or whole year? This 1,80,000 is for 12 months. Right? Sir, do you maintain 12 months ka goods as closing stock of raw material? No. On an average, how much is your raw material holding period? Raw material are expected to remain on an average 2 months ka consumption. You maintain only 2 months stock of closing stock of raw material. Okay. So they've given that. So this 1,80,000 is a raw material stock for the whole year. Whole year ka stock you maintain or only 2 months? 2 months ka. So 1,80,000 is for 12 months. For 2 months, how much is it? Prorated, do it. How much you gonna get? 30,000. That is the closing stock of raw material. Clear? Okay. Then you have to reduce opening stock of raw material. Sir, it's a existing company. For existing company, if closing stock is 30,000 means opening also will be 30,000. So do this plus minus. What are you going to get? Annual raw material purchased. How much is raw material purchased? 1,80,000. Sir, this 1,80,000 is annual purchase of annual purchases. Right? I mean, this 1,80,000 is on what platform? 1,80,000 is for 12 months. Sir, do we get 12 months credit from our creditors or only 2 months? 2 months as per the question. So 1,80,000 is for 12 months. For 2 months, how much? How much is that? 30,000. That is your value of your creditors. These are your 3 working notes. Can we put a working capital estimate wala problem now? It's one statement. Okay, first we will take what? Closing stock of raw material. How much is closing stock of raw material? 30,000. Then what is closing stock of raw material? 18,750. Check. Have taken here. Then closing stock of finished goods. Somewhere we have calculated here. Closing stock of finished goods is how much? 67,500. All these are your respective closing stocks of all the components. Then what are the components of current assets? Debtors. Do we have debtors? Yes. How much is debtors ka value? 67,500. Took that also. Then any prepaid expense. We read the question. Do we have any prepaid expense? Not there. Then cash. Cash was given to us in the question. How much it was given to be? 20,000. So adding all this, we will get the estimated current assets. What is our estimated current assets? 203,750. This we call it as gross working capital. Total current assets only we call it as a gross working capital. We want gross or we want net? Net. So what we have to do? What we have to do? Reduce current liability. What is the first current liability you found? Creditors. So reduce creditors of 30,000. Done, sir. Then any outstanding expense. I think 2 expenses were outstanding if our memory serves right. What is that? Wages and overheads. They are outstanding for how many months? Current month ka wages is paid in the next month. That means 1 month ka wages and overheads is outstanding. Okay, let's calculate. Sir, what is your total labor cost for the whole year? The total labor cost for the whole year is 30,000. That means 30,000 is for 12 months. Is 12 months ka wages outstanding or only 1 month? For 1 month, how much? When you prorate, you will get 2,500. That is your outstanding labor cost. Similarly, what is your outstanding overhead cost? 60,000 is a total overhead cost, meaning it is for the whole year, 12 months. Is 12 months outstanding or only 1 month? 1 month. That means this will be how much? 5,000. So 2,500 and 5,000 rupees is your outstanding expenses. Done. Adding all this, you will get total current liability to be 37,500. Total current asset is 203,750. Current liability is 37,500. From current asset, if you reduce current liability, you will get net working capital of 1,66,250. To this, generally we add safety margin, but in this problem we have to add it or no mention. No mention, 0. So your net working capital becomes this much. That's it. Manageable. Everybody cool? One more question can we take up on working capital? Okay, next is question number 23 in our class notes. This is another type of question that another way through which they will ask a working capital problem. This is also a study material question only. Okay. Anija Limited is a newly formed company. Newly formed company means, will that newly formed business or company have any opening stock? No, that means there is no opening stock of raw material, no opening stock of WIP, no opening stock of finished goods in this problem. Okay. So they have given the following information for the current year. Check. Estimated level of activity 1,04,000 completed units, 4,000 units of WIP. In the last problem, was WIP units given separately or not given? Hence, we worked out WIP through some way. But here, no sir, we don't have that drama at all. On an average, how much WIP stock we maintain? 4,000 units. We maintain WIP stock of 4,000. But we want the WIP closing stock in units or value? Value. How do you get value? Take the units and multiply it by the price. That means like last problem, should I have to do all that proration or direct multiplication? Direct multiplication. Understood? These are the two ways through which usually a question gets framed. Okay. Raw material cost is how much per unit? 80. Wages is 30. Check this. Overhead cost exclusive of depreciation, not inclusive. They said excluding. Excluding depreciation, it is 60. That means should we have to do anything or nothing? Nothing. If depreciation, if it was included means, then we have to exclude because we prepare working capital estimate on a cash cost basis. That's the reason. Here, since it is already excluding, we don't have to do anything. Done. Total is 170. Selling price is 200. So expected profit per unit is 30. Great. Raw material stock we maintain on an average for 4 weeks of consumption. Last problem data was given in months. Here it is given in weeks. That means denominator here everywhere will be 12 or 52. 52 because in a year there are 52 weeks. Okay, so we maintain on average 4 weeks of raw material consumed as closing stock of raw material and assume 50% completion with respect to conversion cost. For conversion cost, they've given DOC to be 50%. In fact, they don't have to tell this. We know it. If nothing is mentioned, any which way we take what? 50%. For raw material, we take it to be 100%. For conversion cost, we take it to be 50%. Okay, material are issued at the start of processing only. So all the material are issued at the start only means the raw material ka DOC is 100%. Okay, finished goods, how many units we have? Finished goods in stock. I mean, this is what? Closing stock of finished goods in units. But we want closing stock of finished goods in value. Credit given by our creditor is 4 weeks. Debtors gives us a credit period of 8 weeks. Lag means delay, sir. Delay means outstanding. Lag always means delay. So that means outstanding wages. So wages is outstanding for how many weeks? 1.5 weeks on an average if we have as outstanding wages. Fine. Cash at bank is expected to be maintained for 25,000. Using this data, we need to find out working capital estimate. Can we run through this question? Okay, this also has come. This type, in fact, they will just change the name and this particular value, and like this also many times the question has come. Okay, let's start. In fact, you will quickly guide me here. First one is what? Working note number 1. What is it for? WIP. Tell me. Like last problem or straightforward? Straightforward. Why? Number of units directly given. How much is WIP ka units? 4,000 units. For WIP, you will incur material cost also, labor cost also, conversion cost also. But 100% extent, no. Lesser, maybe 20, maybe 50, maybe 80, depending on the question. So first we will take what, sir? Material cost. So how much is WIP ka units? 4,000. What is the material cost per unit they gave in the question? Raw material cost per unit is 80. So 4,000 into 80 you do. Okay. Yes, people, you'll get total, right? Into DOC. Into DOC. What is degree of completion for material? 100%. So material ka value is 3,20,000. Then labor. Doesn't matter. WIP ka closing stock is how much? 4,000. What is your wages cost per unit? Wages cost per unit is 30. But is wages ka DOC 100% or only 50%? So what you will do? 4,000 into 30 into 50% DOC, you will get how much? 60,000. Similarly, overhead cost. 4,000 is the closing stock of WIP. What is the overhead cost per unit? Overhead cost per unit is 60 multiplied by DOC of how much? DOC of 50%. So 4,000 into 60 into 50%. If you do, you will get 12 or 1,20,000. Adding all this, you will get the closing stock of WIP to be 5 lakh rupees. First working out over. Wait or carry on. Working out number 2. Working out number 2. Enapa? Data, Solupa. Every pandrathu. First one.
Materials.
Annual raw material consume. Annual raw material consume. But be careful over here. Here, how many units you have already completed? 1,04,000. How many units is in your WIP? 4,000. For finished goods also, you will incur some material cost. For WIP also, you will incur some material cost. Correct? Now, so both you need to add. You need to be careful there. So how much is the finished goods? 1,04,000. And to produce this 1,04,000 units, how much is the raw material cost you will incur per unit? 80. That means how will you calculate? 1,04,000 into 80. This is for what? Finished goods. For raw material, how much is the raw material? 4,000. What is the raw material cost per unit? 80. Is 100% complete? Yes. Multiplied by DOC, 100%. In fact, this portion should we have to calculate or already done? Already done. So you can take it from WIP working out. So multiply this. How much you going to get? When you calculate this, that's what I've done here. 1,04,000 into 80 plus directly I've taken 320. Where did I get this 320 from? Previous working. Okay. Alright. How much is the total raw material consumed? 86,40,000. Same thing we'll have to load for other cost as well. Labor and overheads. So how many units finished? 1,04,000. What is the wages cost per unit given in the question? 30. This is for finished goods. For WIP, how much labor cost you have incurred? 60,000. Add, you will get how much? 31,80,000. Okay, G. Next is overhead. How many finished goods have you produced? 1,04,000. What is the overhead cost per unit? 60. This is for finished goods. For WIP, how much overhead cost you have incurred? 1,20,000. Add it. So totally you will get how much? 63,20,000. Adding all this, you will get the factory cost to be 1,81,80,000. Portion is done. Next, what you will take? Factory cost you have got. Then you will take opening stock of WIP. You will add closing stock of WIP. You will minus. Opening stock, I'll have a big smile. Just I'll write 0. Why? New company. New company ka opening stock will always be 0. Closing stock, can you make it 0 or we found? We found. What is the closing stock of WIP? 5 lakh. So reduce this. Hope this is clear for everybody. So doing all this, you will get the cost of production. How much is cost of production? 1,76,80,000. To this, you add admin expense, no data. So 0 plus opening stock of finished goods 0 minus closing stock of finished goods we need to find. How? Finished goods, sir, you incurred the cost of production. Why? You incur this much of cost of production to produce finished goods, right? So 1,76,80,000 is the cost to produce what? Total units. Total units. Yes. So here they've given they've not given the data in days and all. They've given the data in units. Hence, we have to solve in units. 1,76,80,000 is the cost to produce 1 unit or 1,04,000 units. So 1,76,80,000 is the cost to produce 1,04,000 units. Sir, do you maintain 1,04,000 units of finished goods as closing stock? No, they have given in the question. How much finished goods of closing stock do you maintain? 8,000. For 8,000, how much is the cost? For 8,000, how much is the cost? Prorated and tell me how much is that?
13 lakhs.
That's what we have done here. 1,76,80,000 divided by 1,04,000 into 8,000. If you do, you'll get 13 lakh 60,000. Any confusion? No. To this, if you do, you'll get cost of goods sold. To this, you add selling expense, no info, so 0. You'll get the cost of sales. Have they told credit sale is only 70%, blah, blah? No. Assumption is what now then? Total sales and credit sales are same. That means annual cash cost of credit sale is also same. You will use this data to find what? Debtors. This 1,63,20,000 is for what? Now 1 minute. Debtor ka data they have given in units or in days? Debtor ka. See, you will have to see. There are two ways to structure the question. Either they will link it with days or they will link it with units. Cost of production, here cost of production ka, it was linkage with units. Yes, that's the reason we worked out in units. Now debtor, have they told we have 10,000 units of debtors? They told what? Debtor ka data is given in units or debtors ka data is given in weeks. That means we'll have to work it out in or we have to prorate in weeks. Like that. So check how they have linked and accordingly find out. Okay. Alright. Now check what is it? Where is it? 1,63,20,000 is annual cost of credit sale, means it is for 1 day or whole year? Whole year. And here the data is given in months, days or weeks. Weeks. That means this 1,63,20,000 is for 52 weeks. 52 weeks credit will you get from debtors or only 8 weeks? For 8 weeks, how much is the value? Like that you need to prorate. Understood everybody? When to apply units ka linkage, when to apply days or weeks ka linkage, depending on the data. If they have linked it in units, means you also find the value in units. If they have given the data in weeks or days, means you find out the data in weeks or days. Like that to find out. Done, Saru? Working out now two done. Third one. What is third? Creditors. For creditors, what do we need? Annual raw material consumed. Rather, we need annual raw material purchased. We need, but have they given that or they have given consumed? They have given consumed. We have to find out purchases. How do we find that? Take annual cost of raw material consumed. To that you add. To that closing stock of raw material you add. Opening stock of raw material you minus. Opening stock of raw material I'll not even worry. I'll directly write 0. Why? New company. Cost of raw material consumed, I don't have to work it out again. I've already done. Total annual raw material consumed is how much? 86,40,000 from previous working note. Again, sir. Okay, stop. Now raw material ka data check. This 86,40,000 is a total. Right? Now raw material ka data they have given it in units or they have given it in weeks. Check how they have given the data. Raw material ka. They have given we maintain raw material ka stock in units or weeks. If they give the data in weeks, we have to calculate or we have to prorate in weeks. Okay, let's do that. So annual raw material consumed is 86,40,000. I mean this 86,40,000 is for 52 weeks. Do we maintain 52 weeks ka stock or only 4 weeks ka stock? So multiplied by 4, you'll get the closing stock. That's it. By doing this plus minus, you'll get annual raw material purchased. Using this data, what will we find? Creditors. Again, you need to check creditors ka data given in units or is it given in weeks? I think it's given in weeks only, right? So 93,04,605 is for the whole year. It is for 52 weeks. How much credit period we get from our suppliers? Creditors. 4 weeks. So multiply by 4 you do. How much you going to get? 93,04,615 divided by 52 into 4 weeks credit if you do, you'll get 7,15,740. That is the value of your creditors. Now all the data done. Now dump it into the format. That's all. What is the format? Take all the closing stock first. Then take the debtors. Prepaid expense there or not there? Not there. Cash is directly given in the question to be 25,000. Adding all this totally, you will get current assets. Then you have to reduce what? Current liabilities. Current liabilities are only 2. What are those? Creditors and outstanding expense. Creditors we got it 715. And I think outstanding, what was outstanding? Wages. A lag in payment of wages to the extent of 1.5 weeks. They've given the data in weeks. That means we have to prorate in weeks. So check what is your total labor cost. We already have it in working note number 2. Total labor cost is how much? 31 lakh 80,000. Sir, 31 lakh 80,000 is for the whole year, meaning it is for 52 weeks. 52 weeks ka wages is outstanding or 1.5? For 1.5, how much is the value? Like that, prorate. Then current assets minus current liability will give you working capital because there is no safety margin. That's all this is problem all about. Okay, Ji. Yes, people. In current year ka RTP, they've added one more good question on working capital. I'll do that at the end. That way I'll get to know how much attention you paid today's session. Because after 4-5 hours, we'll see how much of it we will actually remember. Okay, fine. For now, I think working capital ka these two problems are good enough. So this is one type. Another type of question, Damaru. Okay, next. Wait, where is it? This is done. Next is cash. Cash budgeting. We have two questions on cash budget. Let's take that up. First, we will learn some theory aspect of it. Then we will move forward. Okay, this is done. Okay, next one. Next, one more type of question that has come. Sir, all the types of question that we are doing in the examination is tested. One among them usually examiner will ask. I'm not saying same question will come. Alright, some 1 or 2 adjustments here and there they will modify. But these are 5 to 6 types of question usually examiner targets from this particular topic. Okay, another type of question is cash budget. They'll ask you to prepare cash budget. Okay, budgeting means pakka number or estimating. Estimating. They may ask you to prepare the budget for 3 months, 6 months, 4 months, whatever. So 4 months ka cash information we need to estimate. Okay, there are multiple ways to prepare this cash budget, at least theoretically. Practically we use only one, and here also I say test only one. Theoretically we can get that budget using receipts and payment method. That is the first way to calculate the budget. As the name itself is saying, receipts and payments method. We will estimate all the receipts. We will estimate all the payments. From receipts, if you deduct the payments, you will get the cash. That is one way of preparing your cash budget. Okay, this is what is usually comes in your examination also. Another one is adjusted income method. Adjusted income method means from profit, we try to prepare cash. From profit, we try to get cash information. You remember in advanced accounting, we prepared cash flow statement. In indirect method, if you remember, from profit only we get operating cash flow, right? This method is like that only. From profit, we try to get your cash information. How? Simple. Profit, no, P&L account, no, sir, will only consider cash expense or all expense? All expense. But for cash budget, we want only cash expenses and cash income. Whatever non-cash expense and whatever non-cash income that you have in your accounts, that you eliminate. Automatically, you will get what's a cash information. That is another way of preparing the cash budgeting. Okay. Another way is adjusted balance sheet method, where in balance sheet also cash will come. You estimate the components of balance sheet. What are the components of balance sheet? Assets and liability. All assets, all liability, share capital you estimate and get cash as a balancing figure. All other components you estimate and get cash as a balancing figure. That is your adjusted balance sheet method. Okay, but for our examination, this one is only relevant. That is receipts and payment method. How this works, let's understand with the help of one question. I'll just quickly tell you. Question number 25 in our class notes. Again, it's there in the study material only. As much as possible, I've tried to pick the question from study material only. Because I got to know the last marathon that new audience only come for marathon. Okay, so I think for new audience, they will not have our notes. Mostly they'll be referring to ICA material. So instead of them purchasing the notes, I thought anyway revision. No. So no point. So I thought I'll pick up these questions only and do it. Yes, people. So let's learn receipts and payments method ka budgeting activity with the help of this particular question. Question 25. Jita limited ante. Selling price of the book is selling price of a book, the one which we never touch. Okay, how much is that? 15 rupees. Sales are made on credit through a book club and invoiced on the last day of the month. Variable cost of production is materially to produce the book. You need material cost of 5 rupees per book, and the labor cost is 4 rupees per book, and overhead cost is 2 rupees book. And selling price is how much, sir, per book? 15. In this selling price, these are all your cost. 5 plus 4, 9, 9 plus 2, 11. 11 minus 15, 4 rupees is your profit. That is what indirectly they are telling us. Same. More or less I picked up the same thing. Correct. Yes. Correct. In this marathon, I'll be doing RTP and MTP extra. Correct. Because question, say every marathon, we don't have to pick new questions and all. So it is marathon is more like a conceptual revision. We have to revise. Whichever question you pick is not important. Whether are you able to revise all the concepts is the most important thing. Because they will just, whatever question we revise, ICI will from new questions. Okay. So with how conceptually you are clear, how approach wise you are clear is what determines how good your marks will turn out to be. Okay. All right. So now coming back, because I've just picked up some good questions. So it doesn't matter what I picked in last marathon. Okay. The intention is which question has good concept where I can explain better. Such questions I pick it up. Done. No. The sales manager has forecasted the following volumes. Sir, sales manager will give you production data or sales data? Sales data. I mean, this is not sales, sales in value or sales in units. From November to August, this is the number of books sales manager is thinking we will sell. Customers are expected to pay as follows. Obviously, when we sell to the customer, business usually operates on a credit sale basis. Means we invariably have to give credit to our customers. So customers will pay what, sir? 1 month after sale, they will pay 40%. 2 months after selling, they will pay 60%. I mean, they are paying us in 2 installment. 1 month after sale, 40% we will recover. 2 months after sale, we will recover 60%. This is the pattern of collection from our debtors. Okay, moving on to the next one. The company produces books 2 months before they are sold. 2 months before selling only you will produce it and keep it. Like here, if you want to sell 1000 books in January, can you produce the books in January or 2 months before only? 2 months before only. If you want to sell 1000 books in January, means 1000 books has to be produced in November itself. That is what not me question saying. That's the approach they follow. Okay. Company produces books 2 months before they are sold, and creditors. Sir, to produce books, we need material. Material we will purchase from creditors. Creditors for material are made 2 months after production. So this month, if you want to produce the goods, you need material. So we will buy the books materials from our creditor this month. Will we pay the creditor this month only or 2 months later? 2 months later as per the question. Okay, sir. Done. Variable overheads are paid in the month following production. We have also some variable overheads here, no? Right? That variable overhead cost, will you pay it this month only or next month? Next month. And they are expected to increase by 25% in April. Sir, currently your overhead cost is how much? 2 rupees. Sir, will it be 2 rupees? No. From April onwards, it will not be 2. It will be 2 plus 25%. So it will become 2.5 from April onwards. Till April, it will be same. From April onwards, from 2, it will become 2.5. 75% of wages are paid in the month of production. That month only you will pay how much? 75%. Balance 25% you will pay in the following month. That's the pattern of payment for wages. And wage increase of 12.5% will take place in March. From March onwards, wage cost will be same or it will increase? By how much? 12.5%. Currently, what is your labor cost? 4. Will it be 4? No. From 4, it will increase by 12.5%. I mean, this is what's a 4.5. Huh? So from 1st March onwards, from 4 rupees, it will become 4.5 rupees per unit as per the question. The company is going through some restructuring and it will sell one of the properties in May. Sir, we are preparing a budget. In budget, we have to show receipts and we have to show payment. We have to show receipts and payment. When you sell a property, it's a payment or a receipt? Receipt. This comes in which month specifically? May. For how much value? 25,000. But it is also planning to buy a new machinery in May for 10,000. So this is a receipt or a payment? Payment. Specifically in which month? May month. Depreciation. I'll not even read further. They can give whatever goalie. I'll ignore. Why? So depreciation cash or non-cash expense? Non-cash expense. So they will tell depreciation was this much, it became that much and all. You can give whatever much. I have already made up my mind the moment I saw depreciation, because depreciation is a non-cash. Non-cash should be ignored. They can give 1 line alone. They can give 100 lines. Doesn't matter. I will not even read further. Depreciation is good enough for me. I have already reached that Buddha zone. Okay. Corporate tax of 10,000 is due for payment in March. So you'll have to pay tax in the month of March to the extent of 10K. Company presently has a cash balance as on 31st December 20x3 for 1,500. Currently we have this much cash. And we need to prepare a budget from January to June 20x4. Sir, we have this cash balance on 31st December 20x3. That is last year. Last year ka closing balance will become current year ka opening balance. So opening balance of cash they have given it is 1500, and budget we need to prepare from Jan to June. That is for how many months? 6 months ka budget we need to prepare. Okay, Saru? Alright. So it's very simple. We have to bring in the receipts. We have to bring in the payment. That's it. Okay. But unfortunately, all the receipts and payments are happening in a straightforward way or some installments and all. Some installments. So we'll have to put some working note number 1. We need to put for debtors, because debtors are not paying in one shot. They are paying in 2 installments. So one working note we will put for collections from debtors. One working note we will put for your variable production overheads ka payment. One working note for your wages. Okay. I think then we can carry on. Remaining everything we'll put it in the format. Okay. So look at the solution. First what you do is, sir, how many sales have you made? Books sold. There's a book sales data from November to August. This is what is given in the question. First, let's copy this data as it is from November. Actually, we need the data only from January to June, because we are preparing budget only from Jan to June. But sometimes, no, instead of worrying about what period to take, it's easy to start with whatever data they have given. That is much easier to tackle. So we will copy the data as it is from November to August. Fine, that's what I've done here. From November to August, whatever sales unit is there, I've copied. Okay, people? Done. So, but when we sell the goods, we want, sir, we are preparing budget means we want the book sold, or we want the number of books sold, or we want sales value. Sales value. How do you get sale value? Number of books sold multiplied by the selling price. Number of books sold data we have to find out, or they have given in the question. These are all given in the question. We just have to multiply by what, sir? Selling price per unit, which is how much? 15 rupees. That's what I've written here. Units multiplied by rate. This is the sales for that particular month. From November to August, this is the sales value. Any question, anybody till here? All cool? Okay, that I've copied. Now, the data relevancy. Sir, in November, how much sales have I made? 15,000. Will my debtor pay me 15,000 now only, or 2 installments? 2 installments. And when will the installment start? This month or next month? They told 40% the debtor will pay within 1 month. Balance 60% the debtor will pay within 2 months. Though you have sold 15,000, will you recover anything from debtors in this month? No. Calculate. 15,000 ka 40% how much? 15,000 ka 40%. One or two I will calculate. We'll do it together. Then we know the pattern. 15,000 ka 40% is how much? 6,000. That 6,000 we'll collect it in November or next month? Next month. So 6,000 November ka sale ka 40% we will collect it in December. So hence 15,000 ka 40% is 6,000 here. Got it? Done? Balance 60% we will collect it in December or next January? January. So 15,000 ka 60% if you do, you will get 9,000. These two if you add, you will get 15,000. That's the collection pattern. Okay. In the month that you sell, will you recover anything? No. When you, in the whatever month you sell, 40% of the sale value will collect next month. Balance 60% you will collect it in the 2 months later. Like that, the pattern is being identified. One more can we try just to be on the safer side? Okay, December. In December month, how much sales have you made? 15,000. Will you collect any 15,000 in that month? No. In that month, you will not collect anything. Next month, you will collect how much? 40%. So 15,000 ka 40% is how much? 6,000. Out of this 15,000, 40%, which is 6,000, you will collect it in January. Balance is 60%. 15,000 ka 60% is how much? 9,000. That you will collect it in 2 months later, which is February. This is how this particular collection pattern happened. Everybody cool? Now, should I have to do this everything or got that? Like that, you'll have to go on putting the numbers. You'll get it. Okay. If you add all this, you will get the total money received from debtors. Now, total level, I will only bring the total for the relevant period. What is my relevant period? January to June. This also I can add. All this also I can add. But do I need December ka money received from debtors? No. What is my budgeting period? January to June. That means I will only restrict from January to June. Other months I can find, but do I want it for budget? No. That means I will only give the total for this. So in January, totally how much did I collect? 6,000 plus 9,000. How much is it? 15. Here 6 plus 9, how much? 15. Here 9 plus 11, how much? 20,250. These are the collections from my debtor for my budgeting period. Other months also you can put it. It's not that you should not put total. It is just that I need it only for January to June. Hence I'm only total for those months. Fine. Now, this is working note number 1, collections from debtors. Carry on to the next one. Okay, next one is payment to creditors. Okay, stop. They gave one data. What is that data? Books are produced in the month of sale or 2 months before? 2 months before only. Here, I'll show you the data in case you have forgotten. Here. The company produces the books 2 months before they are sold. Okay. So, if you want to sell in January means you have to produce the goods in November only. If you want to sell 1500 in March means you have to produce it in January only, like that. Okay, Saru. That means now I will start the data from November. Sir, in January May, if you want to sell 1000 means in November only you should have produced that books. Now same period we will have. We will start from, since for sales, what is the period we took? We took from November to August. I will not change the period. Okay, for creditors also I will take from November to August. So you tell me in November month mein, how many books have I produced? In November mein, how many books have I produced? 1000. Which 1000? This 1000 or January ka 1000? January ka 1000. Because if you want to sell in January, you have to produce it in November. That means you will start copying the data from here to here. Correct, everybody? Everybody, cool. Okay. So November mein, yeah, in fact, I'll write it over here. November mein, how much books you should have produced? 1000. If you want to sell it in February means December only you should have produced that much books. If you want to sell goods 1500 books in March means January only you should have produced that much books. So copy the data from here to there. Okay, sir. That is what I must have done here. Check 1000, 1250, 1500. Check. Number of books produced. 1000, 1250, 1500 up till June. In fact, I have not done it beyond that. I have taken till June. If you want, you can go a little beyond also if data is available. I think beyond June, data is not available. Correct? No. Why? Here. Check if you want. Sir, they gave the sales only till which date? August. Sir, August May, if you have to sell means you have to produce that books in June only. Okay. July May, how much you will produce? That depends on September ka sale. September ka sale given or missing? Missing. So we have stopped our working till June. I hope this is okay for everyone. Okay. Now, so that's the number of books you have produced. This is the data. I'll give you a minute. Just observe that and tell me. This is the number of books that you produced from November to June. Copied the data. That's all. Okay. You'll copy this data for the period of November or you'll start copying from January. You'll copy from the January because January month ka sale will becomes November month ka production. Like that. That we have copied. Okay, Ji. This is what? Value or number of units? Number of units. I am trying to find out payment made to creditors. From creditor will I incur labor cost or material cost? Material cost. And do you know the material cost per unit? Yeah, per book they have given material cost. Check the data. How much is the material cost? Per book the material cost is 5 rupees. Okay. Sir, labor and overhead cost they told it is increasing. For material cost have they told is there any increase happening? No, they have not told that. Okay, that means material cost will be constant. How much is that? 5 per unit. But when will you pay your creditor? Immediately? Yeah. No, company produces the books 2 months before they are sold and creditors are paid 2 months after production. Okay, that means you are delaying the payment to creditor by 2 months. Okay, what is your material cost per unit again? Material cost per unit is 5 rupees. Okay, let's go back to the data. Sir, these are the units, number of books you have produced. Correct? What is the value, sir? What is the total material cost? Total material cost will be number of units produced multiplied by 5 rupees. 5 rupees is the material cost. So 1000 into 5 will give you 5000. 1500 into 5 will give you 7500. Like that, go on. Take the number of units, which is this, and multiply by 5. Any doubt? No? Now, this 5000, when will you pay? This is your cost. When will you pay this 5000 to creditor? In the same month or 2 months later? 2 months later. In installment or one shot? One shot. This 5000 you will pay 2 months later, which is January. This 6250 you will pay 2 months later, which is February. This January ka cost you will pay it in March. March ka cost you will pay it in May. Like that, you just have to copy the data. And we want the payment only from Jan to June. From Jan to June, this is the payment that you have made to your creditor. That is the second working out for how much payment you have made to your creditor. Wait or okay. Next one. Next one, you tell me what is the next working out for same ground mein? Overhead cost window. You can do wages or overhead cost, whatever you call. I think I put variable cost, so I'll start with that. Okay. Variable cost also will incur for production only. Variable overheads also, labor cost also will come what? On the books sold or on the books produced? Books produced. Books produced data again I have to estimate or already done? already done. That means will this data change or same I have to copy? Same, whatever you did for creditor, same your units you copy here also. Done. But don't copy the same cost. Material cost for creditor is 5 rupees. For variable overheads, what is the cost? Let's read the data once again. For variable overheads, what did they tell, sir? Variable overheads initially was how much? 2 rupees. Initially given is 2 rupees, but they told it will increase. It will increase by how much? 25%. It will increase in April. So from 2 rupees, it will increase by 25% and it will become 2.5. From which month onwards? April month onwards, it will become 2.5. So till March, it is how much? 2 rupees. From April onwards, it will become 2.5. So that we need to copy the data. Till March, till here, you will multiply by how much? 2 rupees. This is the number of books you have produced and the overhead cost per unit is 2 rupees. So 1000 into 2 is how much? 2000. 1250 into 2 is 2500. 1500 into 2 is 3000. Correct. I have to multiply 2 only up till March. From April onwards, can you multiply 2 or it became 2.5? 2.5. That means from April onwards, you will take the number of units produced, 2200, and multiply it by 2.5. You will get how much? 5500. Same, 2200 into 2.5 is 5500. 2300 ka 2.5 is 5750. Done, sir. This is what? Payment or this is a cost? This is the overhead cost. When are you paying this overhead cost? Check the data. What did they tell? 75% of the or rather no, where is that? Here no. Wages overheads, variable overheads are paid in the month following production. Are paid in the month following production. Following month means same month or next month. So variable overheads ka settlement, this month ka variable overhead cost you will settle in the next month. Okay. So we need to do that. How much is the variable overhead cost for November? 2000. November ka variable overhead cost you will settle in December. But December is within my budget period or it's not? That's the reason I have not written. If you want, you can write, but December is not in my budget period. Hence, I have not written that value. Okay. Now, December ka variable overhead cost, I'll pay it in January. Is January my budget period? Yes. That means I have copied that. And January ka cost you will pay in February. February ka cost in March. April ka cost in May. May ka cost in June. Like that you have to copy. So from Jan to June, whatever variable overhead cost you have paid, we need because our budget period is only Jan to June. One more working note. What is one more working note? Labor overhead cost. Labor cost also will come for the books produced only. That means books production should have to again estimate or I've already done. Already done. Copy the same data for labor cost also in terms of the units produced. Okay now. Now what is your wages cost? They told originally wages cost was 4 rupees per unit, but they told it will increase by how much? Where is that? Here. A wage increase of 12.5% will take place on 1st March. Till 1st March, it will be 4 per unit. From 1st March onwards, it will increase by 2.5%. So it will become, or rather it will increase by 12.5%. It will become 4.5. Okay. Alright. 4 and 4.5 is the cost per unit. Okay. Till February, it will be 4 rupees per unit. So 1000 is the number of books produced and wages cost is 4 rupees per book. So 1000 into 4 will give you 4000. 1250 into 4 will give you 5000. Till this calculation, I will do it till February. From March onwards, will you multiply by 4 or 4.5? 4.5. So 1900 into 4.5, 2200 into 4.5, you do it, you will get the cost. Done. This is what? Labor cost. When are you settling this? They told in the question, 75% of the labor cost you will settle that month. Balance 25% you will settle in the following month. Me or question saying? Question. So now 4000 rupees is the labor cost for November. So that month only how much will you pay? 75%. 4000 ka 75% is how much? 3000. Balance 25%. 4000 ka 25% is how much? 1000. That you will pay in the next month, which is December. Done? Okay. Yes, people. Okay. December ka what is the labor cost? 5000. Calculate. How much will you pay in December? You tell me without looking at the calculation. Tell me. December ka labor cost is 5000. So how much will you pay in December? 5000 ka 75%. How much is that? 3750. 3750 you will pay it in which month? December itself. Okay. Balance 25%. 25% is 1250. That you will pay it in the next month. That's what I've written here. 3750 and 1250. Manageable? Okay. Like that. I should have to show up for everything or got it? This way, if you add, that means this payment is done in one installment or two installments. Add the two, you'll get the total. Okay. But my budget period is only Jan to June. Only Jan to June ka total I'll find. This one I can find. These two I can find the total. But do I want it for my budget? No. That's the reason I've not done the total. If you want, you can do the total. But for budget period is only Jan to June. This is the working note. That's it. Rest everything they've given the data directly. Okay. Fine. Now we have to prepare the requirement. What is the requirement of the question? Cash budget. Cash budget. Now budget period, we will present like this. Budget period is from Jan to June. So first have one particulars column and have the period. Period is January to June. Copy that. How budgeting works? It's very simple. It's like preparing your cash ka ledger but in statement format. You remember preparing cash account in your accounts. Instead of preparing cash account, you are preparing same cash account you're presenting in ledger format. Like, sir, suppose you have 1,500 rupees opening balance. When you get a receipt, what will happen? Cash balance will be same or will increase? Due to receipt, cash balance will increase. Due to payment, cash balance will reduce. So take the opening balance and add all the receipts and reduce all the payments. You'll automatically get what balance? Closing. That's all we'll have to do. That's it. Opening balance data they've only given in the question check. Our budget period starts from Jan 20x4. They've only given as on 31st December 20x3. Cash ka balance is how much? 1,500. Last year ka closing balance will become current year ka opening balance. So opening balance is how much? 1,500. That is what they've given. Done, sir. Now add the receipt. Sir, try to recollect the question. There are two receipts in the question as far as my understanding goes. What are those? Two receipts given in the question. What are those? One is receipt from debtors. Another one, you sold some assets. That one. Okay. First is receipt from debtors. How much is the receipt from debtors? Copy. We have already done a working note. There's a collection from debtors ka working note. How much is January ka collection? 15,000. February ka 15,000. This data ditto you copy. That's all. These are the receipts from debtors. Collections from debtors from working note number 1. From Jan to June you copy. Done now? Yes. Next, you prepared two more working notes. Those are for receipts or those are for payments. So leave 1 or 2 lines. What you can do is, you don't have to go line by line. Have a format. First start with opening balance. Write receipts. Leave some 5-6 line for receipt. Then start your payment. As and when you identify the data, go on putting in the format. Now, next is a payment. First, payment to creditor. This is the payment made to creditor from January to June. Okay, put it in the payment column. So these are all payment made to creditor that came from working note number 2. Direct copying, that's all. Next is payment made for overheads and payment made for labor costs. That comes from working note number 3 and 4. Any confusion in this? No. All this payment came from my working note number 1 to working note number 4. Now I will go to the data and find if there are any extra receipts and extra payment. I think there are some tax, so sale of asset and all. No. So let's identify that. Where it is. Check anything information we have missed. A company is going through restructuring and they will sell one property in which month? May. For how much value? 25,000. I mean, this 25,000 is a what? For May month ka receipt. So under receipt, under May column, we have to put 25,000. This is your May column, receipt 25,000. Receipt means add. Payment means minus. That's all. Next, we bought a new machinery in May only for how much? 10,000. I mean, this 10,000 is what? A payment. Similarly, we made a tax payment of 10,000 in March. So March ka payment 10,000, May ka payment also 10,000. March and May there is a payment. March 10,000 payment, May ka 10,000 payment. That's it. Anything else is there or that's all? Any other data or that's about it? That's about it. So take your calculator. Now find out the closing balance for me. You had cash ka opening balance 1,500. You received 15,000 from your debtor. So cash balance increased. So add this. Add it up. Then reduce all the payments. These are the 3 payments you have made to the respective people. Reduce all that. How much are you going to get? These 3 payments you reduce. What are you getting? 3250. That's your closing balance. Closing balance for January becomes opening balance for February. And then again do the same activity. Add all the receipts, deduct all the payments, you will get the closing balance. February ka closing balance will become March ka opening balance. Like that, you'll have to go on preparing. Yes, everybody, cool. No, absolutely no issues. Lengthy, but according to me, this is easy. Okay. Cash budget, no doubt, is a very easy concept, easy way to do it. But you can do some clerical mistakes. Josh may, instead of writing in February column, you can write it in March column. All that creative errors happens a lot here. Okay. And time. time is a killer here because this much you have to answer within 20 minutes tops. Little bit of a challenge. Okay. So it is all right. Fine. No problem. As much as possible, first focus on the working note. That's the reason I said have the format quickly. Wherever you see, go on plugging the numbers into the format. Okay. So there is one more way they can ask the budget question. One more way is in this only they can bring one more type of adjustment. We have solved that question in regular class. Now I'll explain it through this question only. What is that particular adjustment? Till here, no problem. No? Any reservations in this? No. Okay. Next one, what it is this is not there. This whatever I've written, it is not there in this problem. It is just one more type of adjustment which can come through your cash budget wala problem. What they will say is maintain a minimum balance of something. Maintain a minimum balance. Like let's use this question ka data. Let us say they mention in the question maintain a balance of 2000 cash. How much cash balance you need to maintain? 2000. That means cash ka closing balance should always be maintained at how much? 2000. That they will mention to you in the question. In this problem, is it there or not there? Not there. If they give that, what to do? If they give that, what to do? Take your calculator, everybody. How much is the opening balance of cash? 1500. Add all the receipts. Only one receipt. How much is that? 16,500 you got. Okay now. So, yeah. And deduct all the payments. These are the 3 payments. And deduct all these payments. In fact, if you add all the payments, okay, fine, do it. No problem. How much you're getting? Huh? You're getting 3250 is what you have a cash balance of 3250. Do you agree with me? I'll write it here. You have a cash balance of 3250. But problem says what? Should you maintain? See, our closing balance was 3250. But is problem telling we should maintain 3250 closing balance or 2000? Assumption. If suppose the question says maintain a minimum, they will say maintain a cash balance of 2000. So do we need to maintain 3250 or we have to maintain only 2000? That means we have shortage or we have surplus. How much surplus? 1250 extra cash we have. So do we need to maintain this much or not required? If you have surplus cash, you will purchase an investment. You will purchase an investment. So in these kinds of problem, you will purchase how much investment now? 1250. Why 1250? Because you have a surplus cash of 1250. So that is your investment. When you purchase an investment, cash balance will be same or it will reduce? It will reduce. By how much will you purchase the investment for? 1250. Now again, in that 3250, reduce 1250. How much you will get? Cash ka closing balance will become 2000. Like that. So when you have surplus cash, will you keep that money idle or invest? Invest. That's all you have to do here. Done, people? Okay. This is the January. That's what I've done here. Opening balance is 1500. Receipt from debtors is 15,000. We had one payment or we had 3 payments in January? 3 payments. All the 3 have total. When you total all the 3 payments, it comes to 13,250. When you deduct it from here to here, you only told the cash balance available is 3250. But we needed 3,250 or only 2,000. So how much surplus we have? 1250. That 1250 ka investment we will purchase. So the cash closing balance will become 2,000 rupees. Okay, people. Now one more month I will do this and see what will happen. Sir, January ka closing balance. Look at the screen, everybody, for a minute. January ka closing balance will become what? February ka opening balance. Now February ka all the receipts you add. What are the receipts we have in February? 15,000. Again 15,000 we have, which I have added. Check the screen. Okay till here. Similarly, February mein how much and all payments we had? We had 3 payments. Add all those 3 payments. These 3 payments you add. 6250, 3,000 and 7,500. If you add, your calculator is showing how much? 16,750. This is the payment you are supposed to make in February. Correct? Now take your calculator. How much cash you had at the beginning of February? 2,000. How much receipt you got? 15,000. So totally till here, how much cash you have? 17,000. In 17,000, 16,750 ka payment you made. How much cash balance? 250 cash you have. 250 cash you have. But should you maintain 250 closing balance or 2,000? You have 250, but you need to maintain 2,000. Correct? Now what you will do? Sir, now you have surplus or you have shortage? When you had surplus, you purchase the investment. When you have shortage, you will purchase the investment or sell it. How much investment you purchased in the last month? 1,250. Now sell it. When you sell the investment, your cash balance will increase. Add 1250. How much is it? 1,500. 1,500. Should we maintain 1,500 or 2,000? Still there is how much? Still there is 500 rupee shortage. Take a loan. Both will not come. I have made an example where you have got both. Either investment purchased, 1 month may investment purchased will come, another month may investment sale will come. Okay, like that. Both will not be tested, but in this example, ironically, both came. Okay. Even after selling the investment, if you have shortage, means you have to borrow the loan. When you borrow the loan, cash balance will again increase. How much loan you will take? 500. And the cash balance will become how much? 2000. Like this. Fine people. So first month only if you get shortage means what you will do? Sir, first month may if you get surplus, what you will do? First month may if you get surplus, you will invest. First month only if you get a shortage, you will take the borrowing. Next, when you get surplus, will you purchase investment or you will repay the borrowing? Repay the borrowing. Okay, both will not come, people. When you have surplus, you will purchase the investment. When you have shortage, you will sell the investment. Either this scenario will be asked in the question, or first month only if you get a shortage means you will borrow the money. Next month may if you have surplus means you will repay the money. Like that. Both will not come. At least what I have seen, both will not come. If both comes also, what to do? This example is taking care of it. Okay. But usually I say ask this scenario. These two as a combo or these two as a combo. Not everything. This is one more adjustment or one more type that can come in the same budget wala problem. If the number of adjustments in budgets are too many means this they will cut. This they will not ask. Okay. Otherwise, if it's a short budget wala problem, this also they will bring it in as an adjustment and ask it. This question also we have done. I think 1 or 2 questions like this also is available in our regular class notes, but I think we don't need any extra question for it. Okay. So this is done. No. Next. What is next? Sir, break, sir. No break. Yeah? We will finish this topic and then only break. Yeah. Topic after topic break. Between topics, no break. I am speaking. You are listening. Sir, what do you know, sir? Our ears are full of blood. Okay. Cash budgeting pola problem done. Then we have cash question number 11. Come to question 11 from our class notes. Again, it's a study material question. I think. Yeah, I think study material. Okay. Now this is actually not new things. Okay. Show question number 11. This is not a new thing. It is just, you remember you did operating cycle. How did you calculate operating cycle? Operating cycle R plus W plus F plus D minus C. And how did you calculate number of operating cycles in a year? 365 divided by operating cycle period. Then you also calculated working capital. Same way, we have something called cash cycle. We have a cash cycle. Cash cycle, operating cycle, one and the same. Same data, one more question. Quickly, we will do it. Actually, ideally, this is not required. But okay, anyway, I have told it. Now, I'll do it. Following information is available for sizer. On an average, debtors are collected after 45 days. Inventories ka holding period is 75 days. Creditors ka payment period is 30 days. That's what they've given. Sir, is it necessary every company should have raw material and work in progress? No. Only manufacturers will have raw material and work in progress. Traders and wholesalers will only have finished goods, right? So hence here a raw material work in progress not given means probably he's a trader. This company is, in fact, they told it's a SAI trading company. So they only purchase and sell the goods. Okay. Credit, they've given firm spends 120 lakh annually at a constant rate. This is an annual operating cost. It can earn 10% on their investment. You need to find out cash cycle. Same. Instead of operating cycle, they are calling it as a cash cycle. Operating cycle is that only, in how many days will you be able to recover your cash? How do you get this? Same. R plus W plus F plus D minus C. Here R and W is there? No. That means directly you can write what? F plus D minus C. So do that. Tell me what is operating cycle. Raw material work in progress is 0. Finished goods holding period given in the question 75. Debtors credit period is 45. Creditors payment period given in the question 30. So number of cash cycle or operating cycle is 90 days. Yes, sir. So that means if you invest the money today, you will be able to recover your money within 90 days. For 90 days, your funds or your cash is getting blocked. This is first. Then they say number of cycles in a year. Instead of number of cycles in a year, they call that as a cash turnover. Cash turnover simply means how many cycles can you do in a year. To run one cycle, how many days it takes? 90 days. Okay, and they've given in the question, I think 360 days somewhere. Yeah, where is it? Here. Assume 360 days are there in a year. Okay, sir. To run one cycle, we need 90 days. And in a year, how many days are there? 360 days. So how many cycles can you run in this particular year? 4 cycles. Correct? No? 360. How to express that as formula? What it will be? Number of days in a year divided by cash cycle. That if you do, you will get something called number of cash cycle. That is only referred to as cash turnover. So how much is that now? 4 times. Done, people? Okay. So now we can also find out working capital as a shortcut method. Working capital. Sir, how much are you spending on an average every year? What is your spending amount? 120 lakhs. So on an average, your operating cost is 20 lakh. Remember, you did a working capital through that problem previously. How did you calculate working capital? Annual operating cost divided by number of operating cycle. Same thing here. Sir, annually you are spending how much? Annually you are spending how much? 120 lakhs. And annually, how many cycles are you running? 4 cycles. I mean, this 120 lakh is a cost for 1 cycle or 4 cycles? 4 cycle. What is the cost for 1 cycle? 120 lakhs is a cost for 4 cycles because this 120 lakh is for annual data. And these 4 cycles also are done annually. So 120 lakh is a cost for 4 cycle. For 1 cycle, what is the cost you need? 30 lakh. That is your working capital. This is another shortcut method to get working capital. One way of calculating working capital is estimating current assets and estimating current liability. This is another way to calculate the working capital. But all these are estimates problem, not pakka numbers. Done. Depending on what they've asked, accordingly you do it. Easy, people. Now they've modified this question and brought in one more. What is that? This is over. Next check. What is the savings by reducing the inventory holding period by 30 days? If you reduce your inventory holding period by 30 days. Sir, currently what is your inventory holding period? Currently it is 75 days. Will it be 75? Yeah, it will reduce by 30. It will reduce by 30 means now the revised inventory holding period will be 45 days. From 75 it has become 45 days. Okay. So this is your, what is that, pa? Oh, suddenly. We'll talk later. Yeah. 75 minus 30 will become 45 days. Now 45 days will become your inventory holding period. Now you calculate your cash cycle. How do you get cash cycle? How do you get your cash cycle? F plus D minus C. Now finished goods you are holding only for 45 days. Your debtors collection period is still 45 days. Your creditors ka payment period is still 30 days. So 45 plus 45 is 90. 90 minus 30 is 60. Now your cash cycle became 60. So what is your cash turnover? To run one cycle, we need 60 days. How many days are there in a year? 360. To run one cycle, 60 days means in a 360 days in a year, how many cycles can you run? 6 cycles you can run. Okay, people. Now, how much working capital you need? Sir, annually, what is your operating cost? 120 lakh. And annually, how many cycles are you running? 6 cycles. So 120 lakh is a cost for 6 cycles. For one cycle, how much is a cost? 20 lakhs. Yes, people. Earlier, how much it was? Earlier, your cost was working capital was we calculated to be and we got it to be 30 lakhs. Earlier, it was how much? Before this change, the working capital requirement was 30 lakh. Now from 30, it has become how much? 20 lakh. So it has increased. The working capital requirement has increased or it has reduced? Reduced. How much it has reduced by? 10 lakh. That's what they are asking. Okay, this is the savings. Sir, if they had not given the rate, I would have said savings in working capital is 10 lakh. Okay, but have they given the, what is that rate? Check. It can earn 10% on investment. Sir, earlier, how much working capital investment you required? 30. But now due to this reduction in inventory holding period, you need how much working capital? 20 lakh. How much working capital reduce? 10 lakh ka investment now is required or not required? If you don't require that investment, will you keep the money idle or you will invest? And if you invest, what are you going to get? Return. Return is at what percentage? 10%. So this 10 lakh now you can invest and generate how much return? 10%. This is a savings. So how much savings are you able to get? 1 lakh rupees. If this percentage was not given means 10 lakh only, I would have called it as savings. Since this percentage is given, we will calculate that return and call it as savings. Another kind of problem. I mean, it's same, right? Previous problem ka little extended version you could say. Another type of question. Polama. I'll show you much. Hang on. But this is okay. Okay. Where is the next one? This is the question part. Someone wanted that question. This is the question I'm planning to do in marathon today. Okay, so this done. Another 3 more in case you're wondering. Break, sir. After that, you also need a break. I also need a break. But that after that three problem will come after 1 hour only. Sorry for disappointment. Wait. Okay. Next, sir. Wait. Okay. I am speaking. I am only not doing gajibiji. You are doing gajibiji. As I told, no, some days we need to push ourselves. So this is the day you push yourself for 1 hour. No matter how much you feel, sir, breaks are enough, sir, the moment mind drifts, pull it back and say, 1 more hour. 1 more hour. Just 1 more hour. In a 24 hours time, I am just asking for 1 more hour. Not even 5%. Not even 5%. Yeah? Okay. Vindas, sir, you are just speaking. Someone, look at that. Look at the way they are asking. They are saying, sir, you are just speaking. She has written in small caps. Sir, we are listening, sir, in bold letter. Dishuma. Yeah. Okay. Next one, not that important. Quickly we will run through. Sir, every company has to maintain some cash balance. Right? So, 2 Mahanubhavas, Brahaspatis, have told how much cash balance should the company ideally maintain. How much cash balance should the company maintain? That only we call it as Baumol model and Miller-Orr model. David Miller model. Okay. William Baumol model, Miller-Orr model. Our Baumol model, no, copy paste. EOQ. What is EOQ? Economic order quantity. In costing, you wrote square root of 2 AOC. A for annual demand, O for ordering cost, C for carrying cost. Here UPS. Current pola, pochena, enna on pano. UPS. Square root of 2 UPS. Instead of AOC, it is UP. Yes. U for annual cash disbursement. Same drama. Okay. Instead of AOC, it is UPS. Okay. U here stands for annual cash disbursement. P for transaction cost. C for opportunity cost. Baumol model ka drama is, sir, when you invest the money, suppose I have surplus money, means I will invest it. To invest it, I will have to take the help of a broker. Broker will put chuna, brokerage, right? That is your transaction cost. Right? If you don't invest, you will get the return or you will lose the return. Okay, so this is trying to calculate how much you should invest. So that your transaction cost and opportunity cost is minimum. That's what we are trying to calculate here. That is simply given by the formula square root of 2 UPS. U and P will come in the numerator, S will come in the denominator. U for what, sir? Annual cash disbursement. It will be given to you directly. P for transaction cost, like your brokerage or commission or whatever. S is your opportunity cost. They will give it to you in percentage, 8%, 10%, whatever. Substitute, you will get the minimum cash to be maintained. None, that's all. This data will be given, so I will not go into any problem on this. Substitute. Next is Miller-Orr model is laughing at Baumol and saying, what the macha, so nonsense you are telling. Okay. Sir, as per Baumol model, every company will apply the square root of 2 EPS. Sir, Miller-Orr model is saying, sir, can every company maintain same cash balance? Can every company maintain same cash balance? Or another drawback of William Baumol model is, every month you will more or less maintain the same cash balance. Every month you will maintain the same cash balance. Is that applicable? Is that practically applicable concept or outdated? Outdated. Now it's exam season. During exam season, we can conduct the same class or we have to do more class. During normal session, we do regular class. During exam season, along with regular class, we also have to do marathon class. Correct, no? And teachers will do marathon cost at free of cost or pay money. Correct, no? That means during the examination season, ArivuPro should have same cash or higher amounts of cash. Because we are doing more classes, means we have to pay more money to the teachers. So that means every month can we maintain same cash or not possible? Not possible. Hence Miller model is saying, boss, your EOQ type model will not work. We can't maintain same amount of cash every month. Cash balance will fluctuate, right? So hence Miller-Orr model said, I will give you 3 limits. Upper limit, lower limit, return point. You know water ka chemical formula, chemistry? H2O. Here it is HZO. Instead of 2, name is also similar. See, instead of 2, you just write it as like this. Okay, H, instead of H2O, it is HZO. Okay, H is upper limit, Z is return point. Okay, Z actually it is not O, is actually 0. It is your lower limit. H for upper limit, 0 for lower limit, Z for return point. What is this funda is? Okay, like here, check here. Let us say for one company X Limited, upper limit is 50,000. Upper limit is 50,000. Lower limit is 10,000. Return point is 30,000. Just some assumption I have made. What Miller or model is trying to say is, the moment cash balance, listen everybody, the moment cash balance becomes 50,000. The moment cash balance becomes 50,000. 50,000 is what? Upper limit. The moment it reaches upper limit, William model is saying you are maintaining very high levels of cash. Should you maintain high levels of cash? No. Now you invest. When you invest the money, cash balance will be same or it will reduce? It will reduce and come back to what? Return point. That means how much will you invest? From 50,000 you have to get back to 30,000 means you will invest how much? 20,000. So when the moment cash becomes upper limit, when it reaches upper limit balance, you will invest and get the cash balance back to return point. Okay, sir? Suppose in a particular month, cash we are holding only to the extent of 10,000. Company is having a cash of only 10,000. 10,000 is what? Lower limit, right? That means company is holding very low amounts of cash. They are having very less cash. What is the minimum? What is the return point? 30,000. The moment cash reaches lower limit, you are holding very low cash, no? You already purchased the investment previously. When the moment cash reaches lower limit, you will sell the investment and get the cash balance to what? To what point? To the return point. What is that return point? 30,000. That means how much investment will you sell? You will sell investment worth 20,000. So that the cash balance will become 30,000. So within this limits, you can play around. Within the limits, you can play around. But once this upper limit gets hit, you will purchase investment and get the cash balance back to return point. Once the lower limit is hit, you will sell the investment and get the cash back again to the return point. So who defines this upper limit, lower limit? Company. Because can ArivuPro and Reliance have same cash? Are we even comparable? Can I use the same, both the companies' ka name in one sentence? Can't even do that because they are not absolutely not comparable. So this limits have to be defined by the companies only. This range has to be defined by the companies. That is what is a Miller or model ka drama is all about. Okay. Yes, sir. Next, sir. Break, sir. No break. Two more types of question and we are done. Or in fact, three more. Sorry, apologies. Next one is creditors management. Creditors management. Sir, managing creditors is also important. Why? Sir, if you maintain high levels of creditors balance, if creditor balance goes on increasing, is there any advantage? Sir, when can creditor balance goes on increasing? We have purchased the goods, but have you made the payment? No. We are waste fellows. We are only purchasing the goods. When creditors ask the payment, we will say tomorrow. Like that we are going on telling. So creditor balance is going on increasing. By doing this, is there any advantage? Yes, there is one advantage. What is that? Free source of finance. Let's say I had to pay the creditor within 30 days. I had to pay 10 lakh rupees to creditor within how many days? 30 days. Let's say I made the payment on the 90th day. When I had to pay? 30. Due date was 30, but when did I actually pay? I pushed. I made the payment on 90th. That means I delayed the payment by how many days? 60 days. How much I had to pay? 10 lakh. Ideally, I had to pay this 10 lakh within 30 days. That means now I have delayed this 10 lakh payment by how many days? 60 days. That means I can use this 10 lakh freely for how many days? 60 days. Suppose I had taken a 60 days loan, means would a bank have given me loan at free or they would have charged money? They would have charged some interest. Here, am I paying any interest? Usually no. Okay. I mean, this acts as what? Free source of finance. So by delaying the payment to the creditor, it acts as a free source of finance for me. That is the advantage. I'll get some free money, which I can utilize for my business purposes. But equally, there is any disadvantages. Yes. So reputation. Creditor is going on asking, give me the money. But you are going on delaying the payment. That means your words will have value or you lose that goodwill. Loss of goodwill will happen. Sir, if you start playing games, creditor also can play the games. Correct? No. What games creditor will pay? He may increase the price of the goods. Earlier he used to supply the goods at 10 per unit. Now he told, okay, for you, macha, just 15 rupees. Only 50% I increase the price. That's all. From 10 he made it as 15. Possible. Or he may say, henceforth onwards, I will not sell you the goods on credit basis. Pay the cash, take the goods. Otherwise, poda. Like that. Or he may say, Govinda Guru, Venda. I will not transact with you at all. I will stop transacting with you. That can also happen. So these are all some advantages or disadvantages. Disadvantages. So hence creditors blindly, can you delay the payment or you need to carefully manage? Carefully manage. That's your creditors management. Okay, sir. Now, how is this relevant for examination? In examination, one type of questions usually is asked from the creditor. What is that? But before that, look at this. They will give you this particular pointer in the question. They will say 5/15 net of 45 days. Like this particular wordings will be given to you in the question. Not exactly same number, but in this format, some numbers will be presented. What it means is, check the screen. This 5 here stands for discount percentage. 15 days here stands for payment. Meaning, creditor is telling, I am ready to give you a credit period of 45 days. I am ready to give you a credit period of 45 days. But by chance, if you make the payment within 15 days, you can take 5% discount. Normal credit period is how much? 45 days. But if you pay within 15 days, creditor is telling us, if you pay within 15 days, we can get the discount from creditor how much? 5. So this 5 here stands for discount percentage. 15 here stands for the early payment period. How many days you need to make the payment to get the discount? 45 days stands here in this case for the credit period. This will be given to you in usually debtors wala problem and creditors wala problem. This framing of sentence will be done. This is what it signifies. Okay. Now you are the finance manager of this company. Now tell me again in this problem, how much discount we can get from the creditor? 5%. But to get the discount, we need to make the payment within 15 days. As a finance manager, we have to decide what. Should we make the payment within 15 days and get this discount? Should we take up this discount offer or ignore it? That wala question. Understood? Everybody cool? That no sir, we have to find out some. Discount is a cost or benefit? Benefit. You will have to find out something here called benefit percentage. That too on an annual basis. You have to find out annual discount benefit percentage or annual benefit percentage given by the formula D divided by 100 minus D into 365 divided by T into 100. That's all. A plain application of this. Data will be given to you. You just have to apply this. Annual discount benefit percentage is given by D divided by 100 minus D into 365 divided by T into 100. D here stands for discount amount. And again, 100 minus D means 100 minus discount amount into 365. That is the number of days in a year divided by T. T here stands for how many days early you need to make the payment to get the discount. T here is for prepayment days, meaning how many days early you need to pay to get this discount offer. That stands for T. We want this in percentage, hence we multiply by 100. Okay. In fact, I had explained you the logic of this formula also. If time permits, I'll explain. Otherwise, we will just apply this. Okay. Now let's take up one question, or maybe I'll quickly tell you the analogy of this. Sir, this is your annual benefit of discount. Suppose you applied this in the formula and you got it to be 15%. You got it to be 15%. Now let's take a rational scenario. Sir, I have to pay the creditor 10 lakh. I have to pay the creditor 10 lakh. And creditor is telling if you make the payment early, you will get a discount. What is that discount offer ka benefit? 15%. On an annual basis, if you calculate that benefit percentage, it is how much? 15%. Sir, stop. If I have to make the payment to creditor, means first I need to have money. You need to have money, correct? And to get the discount offer, I have to make the payment on the due date or early payment. I have to make an early payment. Okay. Let's say I have to make an early payment of 50 days. I have to make an early payment of 50 days. Assumption. If I make the payment 50 days early, I will get a discount. Okay. Sir, to make this early payment, I need to have the money. I need to have money. Now, if I have idle money, if I have surplus money, what I'll do? I'll keep it idle with me or I will invest. If you invest, what are you going to get? Return. Let us say your investment is giving you a return of only 12%. On an annual basis, your investment is giving you a return of only how much? 12%. Sir, discount benefit ka annual discount benefit percentage is how much? 15. But investment ka return percentage is only 12. Which is better? Investing the money is better or paying the creditor is better? Paying the creditor is better because creditor ka benefit percentage is 15%, but investment ka benefit percentage is only 12. So if this is greater than this, means discount offer can be expected. This is what, like this, they will give you some data. We need to calculate this and comment. Sometimes they ask, sometimes they may not ask also. Okay, people. Now, why do we find out annual benefit discount percentages? Sir, return will always be expressed in what? Percentage. That means we want the benefit in value or benefit in percentage. Hence this particular formula. That's all it is. This is a formula that converts that benefit in amount to benefit to percentage. Compare that benefit percentage with investment percentage and give a conclusion. Okay, G. Okay, start, G. One question. You want one question or okay now? What question you want? Yeah, I thought I'll skip. People, I tell you, crazy. They want full recovery. They think whether we listen or not, you should speak. That mindset we already decided. This one. This is an RTP May 2018 wala question. This is not study material question. I don't think so this is there. But anyways, similar question you might have. I don't know. I'd ignore all this pointer. I had written in class notes. I couldn't cut it out. So let it be. Or I'll see if I can erase it now. No, not going. Okay. Old software may also it is not going. New software may also it is not going. Okay. I was lazy to relay it once again and copy paste. I thought, okay, our machas and machis will understand. Yeah. Okay. So look at this. A Limited is a manufacturing business. They require raw material from X Limited on a regular basis. As per the terms of the agreement, payment are to be made within 40 days of purchase. So the credit period given by creditor is how much? 40 days. If you purchase the goods today, within 40 days, you need to make the payment to the creditor. Normal. However, A Limited, the company which is buying this raw material from creditor, they have a choice. What choice? Of paying 98.5 per 100. Instead of paying 100, they can pay 98.5. Sir, instead of paying 100, if you're paying 98.5 means you are getting a discount. How much discount? 1.5. Okay. You can take the discount in one unit terms or total value, answer will be the same. So here, how much is the discount? 1.5. Because instead of 100, you are paying only 98.5 means the discount is, benefit is 1.5. That is only, we call it as a D. Okay. 2x. On or before what? 10th day of purchase. If you want to get this discount offer, you have to make the payment within 10 days. This 10 only we call it as what, sir? T. Correct? Wrong. Oh. T is 30 days. T means what? T means what? How many days early you need to make the payment. So normally the due date is what day? 40 days. But to get to this discount offer, you need to pay within 10 days. That means how many days early you need to make? Compared to the credit period, you need to make the payment how many days early? 30 days early. Instead of paying on the 40th day, now you have to pay on the 10th day. So how many days early you need to pay? 30. That means T is how much? 30 days. Okay. Now calculate the annual benefit percentage. How do you get it? D divided by 100 minus D into 365 divided by T into 100. D here is 1.5 divided by 100 minus 1.5 into 365 divided by T. T is early payment days. How much is early payment? 30 days. Into 100 you do because we want it in percentage. How much is that, sir? 18.25%. Okay, sir. This is your yes. Any problem? You can also calculate at total level also. That is also okay. But this is simple enough. I think I'll restrict to this. Okay, you can calculate this way also. Taking the full amount also you can calculate. Because you have to pay the creditor 100 rupees or they told you have to pay the creditor 10 lakh. Average billing check here they've given. Should A Limited accept the discount offer with an average billing of how much? We need to pay the creditor on an average how much value? 10. You can take 10 lakh and do the value. How? Very simple. Sir, instead of paying the creditor 100, you are paying how much? 98.5. So is the 100 actual value or 10 lakh? 10 lakh. For 10 lakh is actual value means will you pay 10 lakh or lesser? Lesser. How much is that? 10 lakh into 98.5 divided by 100 if you do, you'll get 9 lakh 85,000. Meaning instead of paying 10 lakh, you are paying only 9 lakh 85,000. So what is the total discount you are getting? Instead of paying 10 lakh, if you're paying 9 lakh 85,000 means you are getting a discount of 15,000. Like that also you can take. So that's the reason I talk here 15,000 divided by 985. Okay, that is one way to work out. Even if you work out like that, you will get the same answer. But I feel this is easier. Why to prorate and all that. Done, people? Now I should have to explain the logic of this formula or this is comfortable? Comfortable or not required for the logic? No, I had explained to you in regular class. Now I think it's okay. We can remember. It is just a benefit being percentage. Actually, or simply, if you want 1 minute, I'll tell you. Okay. Or okay, if some people may say, explain, no sir. Why sir? We will remember, no sir. What is this funda is? Okay, 2 minutes, I'll take it off. Sir, instead of paying 100, you're paying how much? 98.5. How much less are you paying? 1.5 you're paying, right? 1.5 less you're paying. That's a discount. Sir, you are paying how much? 98.5. It's like GP percentage. How do you get GP percentage? GP by sales into 100. GP is the benefit. Here, how much is the benefit? Benefit is 1.5. Okay. How much are you paying? 100 or 98.5? Yes, no. That means what is the benefit percentage? What is the benefit percentage? GP divided by sales into 100. Here the benefit is discount. So it will be discount divided by the payment amount into 100. How much is the discount? 1.5. Divided by payment amount, how much? 98.5. If you do that, what are you going to get? You'll get 1.52 percentage. Yes, now people. 1.52 percentage. Sir, this 1.52 no is a benefit for making the payment how many days early? 30 days early. So, I mean, this is the benefit for whole year or 30 days? This is the benefit for 30 days. But our investment ka return, it will be expressed on 30 days or whole year? Whole year. That means we need to annualize this. For 30 days, if the benefit percentage is 1.52 means for 365 days, how much? Multiply. What are you going to get? 365 into 1.52 divided by 30. What are you going to get? Obviously, you will get 18.52. What did your formula give you? Same 18.52. That's all it is. It is just a formula which is prorating. This benefit, what you have got now, is for not whole year. It is only for 30 days. That you are annualizing. You are converting on annual terms and expressing. That's all. Why? Because here, check. The investment return. If you don't pay the creditor, you can purchase an investment. An investment gives how much return? Investment gives you a return of only 15%. And this 15% is for 30 year or whole year? Whole year. That since this benefit is for whole year, discount ka benefit also you should express on whole year. Now you tell me, you'll reject the discount offer or accept it? Accept it. Why? Discount ka benefit offer is 18%, 18.52. But investment ka benefit is only 15. Therefore, the conclusion is you can go ahead and accept the discount offer. That's all. This is your creditor management ka one type of question which can ask for 2 marker. Work here, ji. This one also dumber. Next two also like that only you should go, sir. Like that only we will do. No problem. Okay, next is an important concept called receivable management or debtors management. From debtors management, usually 2 types of question gets asked. 2 types. Okay, first we will discuss one type of question. This also, for those 2 also, I had made a format if you remember. Now, what is the first type of debtors management wala problem is? Sir, let's say till now we used to pay the creditor 30 days, or rather till now we used to give 30 days credit to our debtors. If we sell the goods to our debtors today, we will collect the money within 30 days. Now we are thinking of relaxing this. Instead of 30 days, we want to make it to 50 days. Because our thought process is, if we give more credit to our debtors will buy more. Rather, we will be able to sell the goods to our debtors more. So we will generate more sales, means the profit also will be more. So we are planning to change our existing credit policy from 30 days to 50 days. Okay. Now, as a finance manager, you need to analyze and decide, is this proposal acceptable or not? From 30 days, should we make it to 50? It's not necessarily it has to be increased. It can also be reduced. Like this. So some changes they want to make it to their credit policy. As a finance manager, should we go ahead with this decision or reject this decision? Is what is this type of question? Everybody okay? All right. Now for this also, what we have to do is, okay, very simple, sir. Till now, your credit policy was how much? 30%. That means at 30% current policy, you used to get some benefit, correct? You used to get some benefit. Okay. You first calculate with existing credit policy, what is your benefit? When we say benefit, we mean the net benefit. Okay, let's say the net benefit under this credit policy is 5 lakh. Under our current credit policy, net benefit, how much is the company getting? 5 lakh, assumed. Now under same 50 days also, now we are going from 30 days to 50 days. Under 50 days also you calculate net benefit. Suppose this is 7 lakh. Suppose this is 7 lakh. Now you tell me, you will reject this offer or accept it? Accept it, because this current policy is giving us the company only a benefit of 5 lakh. But new policy is giving a benefit of 7 lakh. So compare it to the old policy. New policy is giving how much extra benefit? 2 lakh. This only we call it as, you know this word, incremental. So we have to calculate something known as at the end mein incremental benefit. If new policy, if it is giving you incremental benefit, means go ahead with the new policy. Otherwise, reject the old one and reject rather the new one and continue with the old one itself. Okay, sir, that's all we'll have to do. So the only question in here is to find out how to find, or rather how to find out that net benefit. How do you get benefit? How do you get net benefit? From benefit, you reduce all the cost. You will get the net benefit. That's all this format all about. Same format. I have done 6-7 questions in our regular class, if you remember. Ditto. Okay, first one is sales. They will give you in this question. Okay, I've written 4 columns because in one question, there's a format I've copied from regular class. In one of the problem, we had a current policy and we had 4 new policies. So we had to select one among 5. That's the reason number of columns are there here. Okay, they can give you only one new policy, or they can also give you 4 new policies. How many ever what ICA wants, they can add. Okay, that is the ICA question. Now I'll only discuss this. Magic, correct. That's what I've done. First one is sales. First is you have to take the sales. Next one you have to take is the variable cost. Sometimes variable cost will be given, may not be given also, we'll see. So second is the variable cost. After variable cost, you need to consider something called fixed cost. Now with variable cost and fixed cost, you add. That only we call it as total cost excluding bad debts. This is the format I had maintained in regular class. You can solve all this in multiple ways. But I had stuck to this, all the problems in this format. So I'm revising in this format only. Okay. So 2 plus 3 you add, you will get total cost excluding bad debts. Okay. Next you have to consider bad debts, and if there's any discount means consider. Then you will get expected profit before tax. We want net benefit. So benefit will be after tax. So reduce tax, you will get profit after tax. Last message you have to consider opportunity cost, and then you will get something called net benefit. If you have remember me doing this and all is a ditto. If you are listening to this for the first time, then we will do a thing. We'll apply it in one question better. Otherwise, okay. What is this? We will see. 1 minute. Hang on. You're looking at me weirdly. Maybe you've forgotten or you have not taken class from me. One of the two. If you have not taken class from me, that is fine. If you have taken class from me and forgotten, ayyo. So drama, sir. Yeah, correct. Life is all drama. Okay. Question number 14. Vangapa. 14. Where is 14? Here. Question number 14, our class notes. Check. What is this? Sir, company is currently having a credit sales of 12 lakh rupees. Under our current policy, we have a sales of how much? 12 lakh. First, maybe just to be on the safer side, I'll read the whole data for you. Then we will discuss the format and put the numbers in that format. Currently, credit sales is 12 lakh. So, existing credit terms. Check. Now, I think you must be comfortable with this. 1/10 net 45 days. What is this one? 1 is a 1% discount. Now, we are getting discount or giving discount? See, sir, sales. On sales, no, we have to give, we will get the discount from our debtors, or we have to give discount. Give the discount. On creditors, we will get the discount. On debtors, we have to give the discount. So we are ready to give the discount of how much percentage? 1% to debtors, provided they make the payment within 10 days. If they don't want the discount offer, they have to pay us within 45 days, because 45 days is a credit period. Okay. And average collection period is 30 days. Crazy data. Sir, if he pays within 10 days, he will get a discount of 1%. Or otherwise, he can pay aram say within how many days? 45 days. But debtors are so buddu people, waste fellow. They are paying us within 30 days. They are neither utilizing credit fully, nor they are taking discount offer fully. Somewhere they are paying in the middle. Waste fellows. They probably bunked our FM class. Yeah. So average collection period is how much? 30 days. Within 30 days, we are usually collecting the money from our debtors. The current bad debts is how much? 1.5%. Now you tell me, bad debts is a benefit or cost? Like this, they will give you various costs. Okay. They will give you some benefit also. They will give you some cost also. So from benefit, you have to reduce the cost. You will get the net benefit. Compare old policy ka net benefit with new policy ka net benefit. If net benefit of the new policy is more, means accept. Otherwise, rejected. So current policy has bad debt of 1.5%. In order to accelerate the collection process further as to increase the sale, company is contemplating, as in thinking, liberalizing. Liberalizing means relaxing its credit terms to 2 bar 10. 2 bar 10. 2 bar 10 means we are ready to give, instead of 1% discount, we are ready to liberalize, relax and give how much percent discount? 2% discount if paid within 10 days. Otherwise, they have to pay within 45 days. It is expected that the sales due to this scheme will increase by 1/3 of the existing scale. If we do this offer, if we go ahead with this particular offer, currently how much is my sales? 12 lakh. Will it be same 12 lakh or it will increase? Increase by 1/3. Calculate 12 lakh ka 1/3. How much is that? 12 lakh ka 1/3 is how much? 12 into 1/3 is 4 lakh. Now, sales will increase by 1/3. That means sales will it be 12 lakh? No. From 12 lakh, it will increase by 4 lakh and it will become how much? 16 lakh. That means under new policy, sales will be 16 lakh. Okay, ji. Fine. Next, what they are saying is, but however, new policy will generate how much bad debts? 2% of sales will become bad debts and average collection period will decline to 20 days. Currently, what is my average collection period? 30. But now it will become, under new policy, it will only become 20. Contribution to sales ratio is 22%. Contribution is 22%. So you know this format. Sales minus variable cost is contribution. Sir, if contribution is 22%, means variable cost is what? 100% minus 22%, which is 78% of what? Sales. Okay, no? Or you can do sales and reduce contribution. You will get automatically variable cost. Like that also you can do. Fine now? Okay, this is done. And opportunity cost is 15%. And we know this. We have already done working capital investment decision. Opportunity cost should be considered on an before tax basis or after tax? What should be considered? After tax basis. But what have they given? Pre-tax. Pre-tax means before tax. We want before tax or after tax? After tax. Sir, how do you get an after tax percentage? Simple way to get after tax is take the number before tax and do 1 minus tax rate. 1 minus tax rate. How much is the tax rate here? 30%. So 15 into 1 minus tax rate, if you do, it will be 10.5%. So opportunity cost ka return percentage before tax, if it is 15, means after tax it will be 10.5. Why is this required? I'll tell you. Okay, 50% and 80% of our customers in terms of sales revenue are expected to avail the discount offer under existing and liberalization scheme. So all the debtors will not go for discount offer. Under old scheme, how much of debtors will go for discount offer? 50% of debtors will go for discount option. Under new scheme, 80% of the customers will go for discount offer. Discount for the company is a benefit or cost? Here we are giving discount to the debtors. That means it is a discount allowed. So it is a cost. Okay. Tax rate is 30%. Advice. Should we go ahead with this new scheme is what we need to advise. They're saying assume 360 days are there in a year. Simple format. Okay. You keep this. If you don't know also, this format will take care of most of the questions for you. Okay. First, you always take the sales. First, you take the sales. Sir, currently, what is my average collection period? 30 days. And my current policy, I don't want the credit period. I want the collection period. Because we want money coming in. Though I am giving 45 days credit to my customer, but my money is coming within 30 days. That means, is my fund getting blocked for 45 days or only 30 days? 30 days. So we are concerned with not with credit period. We are concerned with collection period. If they don't give collection period, we'll assume that credit period and collection period are same. So under current policy, my collection period is 30 days. But under my new policy, will it be 30 or they told it will become 20? It will become 20. I've written the heading. Okay. First thing you'll update is sales. Under my current policy, the sales is how much? 12 lakh. Under new policy, sales will be 12 lakh or it will increase by 1/3. 1/3. That means it will become how much? 16 lakh. This is cost or benefit? Benefit. Got it. Next, some cost we will take it. Variable cost. They told contribution is 22% of sales, not me, question. That means variable cost will be what? 78% of sales. 12 lakh ka 78% you do. 936. 16 lakh ka 78% you do. 12 lakh 48,000. This is benefit or cost? Cost. Maybe I'll write this. This is the okay. And this is the benefit and this is the cost. Next, fixed cost we have to take. Some problems may fixed cost will be given, some it will be not given. In this problem we read, did we find out any fixed cost? No. 0, 0. If it is there, bring it in. Okay, sir. Next, you find something called total cost excluding bad debt. Here, what are the two costs we have identified? variable cost and fixed cost. Add them. When you add them, you will get total cost excluding bad debts and discount. 0 plus 936 is 936 only. These two addition is this much. Okay, people. Why we do this, I'll tell you in a bit. So far, okay. Next, we have two more cost. Can you identify what is that two more cost for me? One, we have bad debts. Another one, discount. So let's do the bad debts. Sir, under my existing policy, they told bad debts is 1.5% of sales. Not me. Question. What is my sales? 12 lakh. Bad debts under existing policy is 1.5%. So 12 lakh of 1.5% is how much? 18,000. But under new policy, the bad debts will become 2%, they told. 16 lakh or 2% will be how much? 32,000. So this is benefit or this is cost? Cost. Okay, sir. Next, one more cost is there, which is discount. So let's calculate that discount. Okay, what is that discount? Sir, they told in the problem, will every of my customers go for discount? No. Under my existing scheme, how many people will go for discount? 50%. Sir, what is the sales? Under existing scheme, the sales is 12 lakh. Okay, 12 lakh. Will 100% of the customers go for discount or only 50%? 50%. That means how much sales? On 6 lakh only we will give the discount. Correct? But we will give entire amount as discount, or how much is the discount percentage? Under old scheme, discount percentage is 1%. How much is that? When you calculate 12 lakh of 50% into 1%, that's what I've done here also. 6,000 rupees is the discount under existing policy. Okay, sir. Same under the new policy, you need to calculate. Under new policy, the sale is how much? 16 lakh. Under new policy, 50% of the customers will go for discount or 80%? Under new policy, okay, the sales is 16 lakh and 80% of the customers will go for discount. And under new policy, is discount percentage 1 or 2%? 2%. So multiply. How much is that? 25, 600 is a discount under the new option. Updated. 6,000 and 25, 600. That's what we have done here. 6,000 and 25, 600. Done, answer. Now you will find out the benefit before tax. When tax is what? Benefit or it's a payment? Payment means indirectly you can interpret to be cost on. So first find the expected profit before tax. How do you get profit, sir? How do you get profit? From income you reduces all the expenses. So first is take your calculator. 12 lakh rupees is your sales. So take the sales. Reduce, don't take variable cost. Now we have already found out total cost excluding bad debts is these two addition. What is the total cost? 9 lakh 36,000. 12 lakh minus 9 lakh 36,000 you do. Got it? Then we have two more cost, bad debts and discount. Reduce these two also. 18,000 and 6,000 also you reduce. How much is your calculator showing? 2 lakh 40,000. That's what I've presented in the number. 1 minus 4 minus 5 minus 6. If you do that, you will get profit before tax of 240. Is your calculator also showing the same number? Sir, this is the benefit before tax. Is there any tax we have to pay to the government? Yes. What rate? 30%. So 240 ka 30% you calculate. How much is that? 72. That much. Don't be liberal much. Government is already making too much money. 24 3s are 72. No, 72,000 is the tax. That's what you said. Oh, you said amount. Like, hey, listen fully. Okay. Profit after tax is how much? 168. That is the profit after tax. Yes, so people. Ideally, our heart to mind kidney is saying this is the net benefit. This is the net benefit. But hang on. One more is there. Opportunity cost. Opportunity cost we should consider or ignore? Consider. What is the opportunity cost here? Everyone look at the screen. Sir, under existing policy, your customers are paying today or after 30 days? That means your funds are getting blocked for 30 days. Instead of 30 days, if your debtor had paid today, instead of paying after 30 days, if your debtor had paid today, what you would have done? You could have invested this money for how many days? 30 days and got some return. Now is the debtor paying you today or after 30 days? That means are you getting that investment return or go in the? You are sacrificing. That is what now? Opportunity cost. Sir, one income if you are not getting means opportunity cost becomes your benefit or it becomes your cost? It's your cost. Understood? That is what. Should we ignore this or consider this for decision making? For accounting opportunity cost, we don't pass any journal entry. But for FM, we always consider opportunity cost for decision making purpose. Done, sir? This is what we need to do. Now, debtor should pay us what? Sale value. Sale value. But in order to sell the goods, first we need to purchase it. Purchase will be made at selling price or cost price. That means how much did we pay to buy the goods? Selling price or cost price? Cost price. That means my fund is getting blocked. My fund is getting blocked to the extent of selling price or cost price. Cost price. That's the reason we don't calculate opportunity cost on the selling price. We calculate on total cost excluding bad debts. Because bad debts will come after you sell. Did I invest any money for bad debts? Did I purchase any bad debts? No. Discount did I purchase? No. What did I purchase? Goods. That's the reason these two should not be considered for your opportunity cost calculation. For opportunity cost calculation, we want how much money got blocked. Money will get blocked to the extent of what? Cost price. Right? Cost price is what? Variable cost and fixed cost. Hence, that's the reason in between these two, we bring in one more column called total cost excluding bad debts. Why I have this data is I need this particular number to calculate my opportunity cost. If opportunity cost is not there, this column entirely you can cut out. This number is what we need to take to calculate opportunity cost calculation. Everybody cool? Now take a number calculator quickly. 9,36,000 is a total cost excluding bad debts. What is your opportunity cost? They have given. How much is your opportunity cost? Sir, opportunity cost is 15%, but this 15% is on a pre-tax basis. We should take pre-tax or post-tax. How do you get post-tax? You do the rate into 1 minus tax rate. If you do it post-tax, opportunity cost return is how much? 10.5%. So take 9 lakh, where is that? Take 9,36,000 into 10.5%. You do 90,600. Some number, okay? But that is a return for the whole year. Sir, is your fund getting blocked for the whole year or 30 days? 30 days. So what you should do? Into 30, 1 minute. In the problem, they say sometimes take 360 and all. Have they told? Yes. Assume 360 days in a year. So into 30 divided by 360, you do. How much are you getting? How much are you getting? 8190. This is your opportunity cost calculation. I have done it on a separate working note here. This is opportunity cost after tax basis. This is your opportunity cost value. Okay, everybody. We should ignore this or consider this. Consider this is an inflow or an out. It's a benefit or a cost. Cost. That means profit after tax is 168. Your opportunity cost is 8190. I should add this or minus this. Minus. So reduce these two. What are you getting? 1,59,810. That is the net benefit under old scheme. This is the net benefit under old scheme. Similarly, can you tell me what is the opportunity cost under new scheme? Quickly, can you tell and make me happy? What is the opportunity cost under new scheme? Quickly. Or tell me the number. Which number you will take? Sales you will take, variable cost you will take, fixed cost you will take, or this number you will take? 12,48,000 you will take into opportunity cost. How much? 10.5%. Multiplied by for how many days the fund is getting blocked under new scheme? 20 days. So into 20 divided by 360 you do. How much are you getting? 7280. So under the new scheme, profit after tax is 206 or this number. From this 7280 you minus, you will get net benefit of how much? 198. Okay, everybody. Sir, old policy is giving you a benefit of 159. New one is giving a benefit of 198. Compared to the old is new giving higher benefit. Yes, that only we call it as what? Incremental benefit. This one is not there. Right? Incremental benefit you always compare with new versus old. So new ka benefit is 198, old ka is 159. So how much incremental benefit, extra benefit new is giving? These two are difference, which is 38. That means will you reject this new policy or accept it? This new policy should be accepted. Why? Because net benefit. One you can answer is sometimes they say calculate incremental benefit and give you the suggestion. If they ask you that, calculate incremental benefit and give suggestion based on incremental benefit. If they don't ask incremental benefit, give a suggestion based on net benefit. You'll always choose a policy with lowest net benefit or highest like that. Check the question what they've asked and accordingly conclude. Okay, sir. So in this case, you'll go for the new policy. This is your evaluation of credit policy wala problem. Okay, sir. Like this. So all the adjustments may not come. Some may be cut off in your examination question also. But usually these are the standard question relating to credit policy. Damar. One more. Can I go for one more now? Okay. Last type of question for working capital management. It's called factoring. It's called factoring. Oh, another 25 minutes. Okay. Papa, you're looking at it. Why? Everywhere you're looking at it. Online people, you're still there, appa? Online people full chill. Yes, no. Watching Gada or watching IPL highlights also simultaneously? Why highlights, sir? We watch the whole match only. Correct, no? Don't watch match and all, da. Watch CA syllabus. We are there, sir. We are there, they're telling. Awesome, sir. Okay, the last concept. What is that last concept? Is factoring here. Factoring. Sir, what is this factoring? Factoring is basically an arrangement through which you sell your debtors to one company. Debtors only usually you sell. Not mandatory you have to sell, but usually for in all our problems we will sell it. Okay, so I'll stick to that. There's one more type of factoring also you can do. Leave that. That's not required much for our syllabus. So factoring is an arrangement where company will sell their debtors to another entity, and that entity only is called as factor. Okay, so let's take a small example. Sir, A Limited is one company. They are the sellers. A Limited is a selling company. They have sold goods to a debtor, and average credit period still is pending is how much? 50 days. That means debtor has paid the money or not yet? No, they will pay after how many days? 50 days. And we have 100 lakh worth of debtors. We still have to collect how much money from our debtors? 100 lakh assumption. And we'll collect this money when? After 50 days. But A Limited wants the money right now because they have some shortage of funds. They need money. But debtor will pay the money now or after 50 days? After 50 days. So in this case, what the company can do is, how much is the debtor value? 100 lakh. This particular debtor, they can sell it to another entity called factor. This debtor itself, they can sell it to another entity called factor. And factor will pay the money to the company. When? Immediately. Sir, will he pay full money? No. Let's say factor paid only 90 lakh. It's based on arrangement. Okay. So let's say A Limited sold their debtors to the factors today, and the factor paid A Limited how much money today? 90 lakh rupees. So this way what happened? A Limited got the money right now. After this, what will happen, sir? Sir, after this, debtor will play the waiting game. Rather, after this, factor will play the waiting game. Factor will wait for how many days? 50 days. After that, factor will approach debtors and collect the money from debtors. How much money factor will collect from debtors? 100 lakhs. So it's a win-win arrangement for everybody. How? Sir, A Limited got the money now. Factor paid A Limited how much? 90 lakh. Factor collected from debtor how much? 100 lakh. That means factor ka commission is how much? 10 lakh. Through this process, factor was able to get a commission of 10 lakh. That's the arrangement. Okay, sir. This is how usually factoring arrangements are done. One form of factoring. Okay, sir. Now, so what do we need for our examination question? Or maybe one more point I'll tell, then we'll dive into the exam related pointers. Sir, factoring are of two types. Factoring arrangements are generally of two types. One with recourse, another one is without recourse. With recourse and without recourse. Without recourse ka another name we also known as sans recourse also they call it. Instead of without recourse, it's also referred to as sans recourse. If they say sans recourse, it simply means, I think this is a French word or something. Yeah, sans means without. Okay, instead of without, they may use sans recourse also. I think in one of the previous paper RTP they used the sans recourse. So that's the reason I thought I will mention this as well. Sir, what is this with recourse? So recoursing means going back. Recoursing means going back. Now here, check in this example. Suppose after 50 days, debtor tells the factor, "Poda day, na kodukka mate. I will not pay you the money." What will factor do? Factor will come back to A Limited and tell, "You have dabba debtor, give my money back." So if debtor does not pay the factor, factor will come back to A Limited and recover the money. If that is the factoring arrangement, means we call it as with recourse. With recourse means going back. If debtor does not pay, factor will go back to A Limited and recover the money. Okay, that is with recourse factoring. If it is without recourse means, if debtor does not pay money to the factor, can factor go back to A Limited or cannot? Cannot. Who will have to bear the bad debt risk then? Factor. So under with recourse arrangement, who will have the bad debt risk? Seller. Seller as in A Limited. Under without recourse arrangement, okay, who will have the bad debt risk? Factor. Okay, sir. For our questions, what we have to do, sir? So for all our problems, if they don't tell you whether it is with recourse or without recourse, always assume without recourse for our examination questions. Okay, just for no logic, just the convention which ICA problems adopt. Always assume without recourse. Without recourse means who will assume bad debt risk? factor. For our exam sake, practically it's a negotiation. Whatever they want, they can arrange into it. That's practicality. Let's not go into that. Now, how is this arrangement or how this particular setup can get asked in our examination is, they'll simply say, company wants to do a factoring arrangement. Company wants to get into a factoring arrangement. Should company do this or not do it? Should factoring ka arrangement be done or rejected? Or factoring ka proposal be accepted or rejected? That's all you have to do. Okay. So when will you accept factoring ka proposal? Tell me. When will you? Just like last problem. When will you go for new credit policy? When? If benefit is greater than the cost. If due to factoring there will be benefit also, there will be cost also. If the benefit due to factoring, if it is greater than cost, means accept. If benefit is lesser than cost, means ideally reject, but don't say reject. There are some extra things to be done. If benefit is greater than cost, straight away accept. If benefit is lesser than cost, you can't straight away reject. You have to do one extra step and then take a decision. What extra step? I'll tell you in the problem. Okay, people. Now, for factoring also, if you remember, I had made this particular format. Same format, 5-6 questions of factoring we had done in our regular class. Probably more than that, I don't remember. Now, I'll do one in the same format so that we get comfort with that. Okay. Alright. What is it? Once quickly, I'll run you through the format and then you take up through one particular question. Simple. Nothing. Don't worry. Just because we see the big format, don't worry. Big number. Just that like they'll give you a lot of data. So we have to dump it into format. So format looks a little big. Nothing. For your standard and all, this is this is like nothing. Okay. Sir, first to know, sir, you have to take all the benefits due to factoring. What are all the benefits due to factoring? We need to consider this. What is that? One by one we will take. First is, now if a company sells the debtors to the factor, company has to take bad debt risk or bad debt saved. If company does not do factoring, means who will have bad debt risk? Company. Now when the moment company sells their debtors to their factor, who will assume that bad debt risk? Factor. Because in our problems, we always assume that it is a without recourse factoring. That means this bad debt loss company has to suffer now or no more loss? No. If one loss is reducing, means it is what? Benefit. So first benefit that you will get in due to factoring is you will save due to bad debts. Because in all our factoring problem, we always assume that it is a factoring arrangement is on a without recourse basis, even if the question is silent. Okay, sir, this is one. Second one is, sir, collecting from money from debtors is an easy task. No, sir, we have to go on calling them, go on sending the emails, and they'll not even pay the money on one shot. If they have to pay 1 lakh, means they will say, take 40,000, balance 60,000, I'll give you tomorrow. And that tomorrow never comes. Again, we have to follow up. That means there is an administrative cost. I have to appoint one person who has to call debtor, who has to follow up with the debtor. Now, if I sell the debtors to my factor, means is that person required or not required? That means that person ka salary saved. That is what? Savings in your administrative cost. That is your benefits. It will be given to you in the question. Done, people? Another one is rare, but sometimes it comes, is your opportunity cost. Now look at this, everybody. Sir, earlier, sir, factoring, no, sir, they have expertise in collection. You know, the moment you say factoring, you can remember that Gunda's bank people will appoint. You take a bank loan and if you don't pay the loan, you know that hatta katta people will come to your doorstep and say, hello, macha. And immediately you'll give all, take my gold, my jewelry, diamond, everything you'll give. Yes, no. That means they have expertise in collection. So who will collect the money sooner? Company or factor? Factor. So now what happened? Checks. So let us say before factoring arrangement, I used to collect money from my debtors on an average 60 days. Okay. Average collection period was 60 days. But after entering into factoring arrangement, our factor, so much of nice Gunda he is able to collect the money within 45 days. Okay. That means how many days early I'm able to collect the money? 15 days. Okay. Let's visualize a simple scenario. Let's say it's one transaction by transaction. What is a transaction? First, I will sell, let's say, what's your name, Macha? Yes, only. Ratish, R. Right? So let's say I am the company, I've sold goods to Ratish. We are doing transaction by transaction arrangement. What is that is? First, I will sell the goods to Ratish. I tell the Ratish, boss, you have to pay me within 60 days. And Ratish says, Anna, I want one more goods. I said, First pay me, then only take the next goods. Okay, that's the arrangement. I will sell the goods today. Okay, he will make the payment after 60 days. After 60 days, one more sales I will make to him. This is the arrangement I have. That means what, sir? How many times in a year can I sell, Ratish? Sir, let's assume that 360 days in a year is there. Okay, if I sell today means I'll collect the payment after 60 days. That means I can sell the goods to Ratish only 6 times. Okay, sir. Now, I'm not happy with Ratish because he's acting cranky. Don't know why. So, I appointed Gunda, factor. Now, I enter into a factoring arrangement. That factor came to Ratish's house. Hello. Ratish told, take my everything. Take my kidney also you take. That means the factor is able to collect from Ratish within how many days? 45 days. Now, in a day, in a year, how many days are there? 360 days. Now, Ratish is paying me within how many days? 45 days. Tell me. 8 times I am able to sell the goods to Ratish. If I'm able to sell means I'll be able to earn more profit. If I'm able to sell goods more times to Ratish means I'll be able to make more profit. This is what? A cost for me or a benefit for me? Benefit for me. And I'm getting this benefit only due to factoring. Because before factoring, my collection period was 60 days. After factoring, it has become 45 days. So how many days I'm able to save? 15 days. That means I am getting money from Ratish in a way early. How many days? 15 days. If I'm getting the money early for 15 days means I can invest and I can get some money. That only is referred to as opportunity cost. Okay. This opportunity cost you will only calculate if before factoring and after factoring collection period has reduced. If this is not there means this particular opportunity cost calculation required or not required? Not required. And given you another explanation regular class, I thought over it. I thought this was better. So I've explained this. Regular people. Okay, this one is okay for everybody. Understood? This will not come in every scenario. This particular opportunity cost will only come when there is a reduction in ACP. ACP means what? Average collection period. If there is only reduction in ACP, then only you will calculate opportunity cost. Otherwise, no. So these are all what, sir? Regular people also okay with this, no, so far? Online? Can I go ahead with the next one? Quickly one tell response. So these are all the benefits. These are all the benefits. Adding all this, you will get the total annual benefits. You'll get the total annual benefits. Now there be only benefits or there will be cost also. So now let's calculate the cost associated with factoring. First cost associated with the factoring is a factoring commission. Factor will not do this activity at free of cost. He will calculate some or he will require some commission. So commission is the cost. They will give you percentage, 1%, 2%, whatever. You take the annual credit sales and multiply it by the commission percentage. You will get the factoring commission. Okay, that is one. It will be given to you in the question. That is one. Second one, in majority of our problem, sir, earlier, okay, here in this particular example, we used to collect money from debtors within how many days? 50 days. Due to factoring arrangement, we got the money from factor now only. But factor will get the money now from debtors or after 50 days. So that means there is a delay in money which the factor is collecting. If there is a delay means factor also may charge some interest for me. Because factor he's not getting the money now, he's getting the money after 15 days. So in these sort of arrangements, there will also be a component for interest. There will also be a component for interest. The question will mention that. How much interest percentage, 8%, 10% and all will be given. So interest is another cost which we need to calculate here. How to calculate? I'll tell you through one problem. Okay. Leave this, whatever I've written, it's okay. This is one. Another, sometimes they will say, due to factoring, there is another cost of 10,000. Like that they will mention. Rare, but in some problems, I've seen this come up. If it is given, bring it in. So this is your total cost. This is your total benefit. This is your total annual cost. From total benefit, reduce annual cost. If you are getting net benefit, reject or accept? Accept. If you are getting net annual cost, meaning if benefit is lesser than cost, if benefit is lesser than cost, we call it as net annual cost. If it is net annual cost, we'll have to do one more assessment. What is that? In a bit, I'll tell you. Okay. So now to calculate this interest for factoring, I had made this particular format with you. In fact, this class, how to calculate this. This will take care of your almost all the questions. Okay. Now how to calculate? Once quickly we will review it. Let's see if you attended the regular class, you will get it. Otherwise, we will try to take a number and see how this works. So we need to calculate in this working note something called interest as well as the amount of advance given by the factor. How much money factor is totally giving us. That's what we are trying to calculate in this particular working note. Okay. First, you have to take something called annual credit sales, because debtor will come with respect to total sales or credit sales. Credit sales. Take the annual credit sales. Sir, usually in factoring arrangement, no, there will also be something called reserve. There will be reserve. Reserve means, like in this particular case, is factor ready to give me 100% or only 90%? Instead of 100 lakh, they are ready to give me lesser amount. Factor is reducing some amount. Okay. Usually that's what happens. Like, let's say you have a building worth 10 crore rupees. You own a building worth 10 crore. Now you want to pledge that document. You want to give land ka document or building ka document to a banker and take loan. What is that building ka market value? 10 crore. Will bank give you 10 crore loan or lesser value? They will deduct some amount. That is what we mean by reserve. Reserve means does not mean factor will not give this amount. Factor will give this at a later date. This is like a safety cushion for the factor. That will be 5%, 10% or whatever it will be given to you in the question. So will the factor is ready to give you credit sale amount or he will deduct something? Deduct something. That means he will never pay this or he will pay. He will pay, but after a few days, maybe 30 days, 40 days, 50 days, or whatever agreement will tell. So if there is a reserve given in the question, reduce it. Question will mention this 10%, 12% or whatever. Then, sir, factor, will they give you full money or factor should also get commission? So first, no, sir, they will reduce their commission and give the balance amount. So if there is any factoring commission, he will reduce that as well. So this is the amount available for advance. From here, if you deduct all this, you will get something called amount available for advance. Sir, is factor only deducting commission or there is also interest? Interest. That means on this particular amount, you need to calculate interest. So take this particular amount and multiply by the rate 15%, 18%, whatever question will give you. Okay, but this rate will be for whole year. Rate will be for the whole year. Sir, in this example, is there any delay for the factor for the whole year or 50 days? Factor is collecting money from the debtor after 50 days. That means how much delay has happened to the factor? Factor gave the money to A Limited now, but factor is collecting the money from debtors after 50 days. So how much delay has happened to the factor? 50 days. Sir, if there is a delay for 50 days means factor will charge the interest for whole year or 50 days? 50 days. That's what we mean by here. So take the amount available for advance, multiply by the rate into factoring period divided by 365. Sometimes they give you the data in days, months and all. Depending on that, your denominator will vary. Okay, sir. He will deduct this interest amount also and then balance amount will be given. Okay, sir. Okay, so you deduct this, you will get this particular value. Done. Okay, 1 minute, look at the screen. This particular number is derived by taking what as the base? What is your topmost number? Sales. Sir, are you selling the sale value to your factor or debtors? Debtors. But in the numerator, topmost number you have taken it as sales. Will factor give you the amount to the extent of say total sales value or debtors value? Debtors value. That means you need to prorate this. Whatever here you have got, no, it is arrived based on what? Sales. Are you selling the sales to your factors or debtors to your factor? Debtors to your factor. Let's say this was 30 lakh. This was a 30 lakh. This 30 lakh rupees is for 1 day or whole year? Whole year. Sir. Will you have to multiply this by the credit period? Will you give whole year credit period to your debtors or lesser? Let's say you only give 40 days credit to your debtors. You only give 40 days credit to your customers. Customers means your debtors. So prorated. 30 lakh rupees is for 365 days. For collection period or credit period of 40 days, how much is the value? Prorate this, how much you're going to get? Whatever. You'll get some value. 30 lakh into 40 divided by 365. Someone do it and tell me how much is that value? 30 into 40 divided by 365. If you do, my calculator is showing 3.28 lakhs. So this is the amount of advance factor will give it to the factor. Or amount of money factor will give it to the company. This is the format. Pure format where we have applied many questions. Okay, G. Yes, G. There is one more format also which I say follows. If you want, I can show you that as well in one question. Okay, people. Yes. This is the thing. Go. After this, one last adjustment you need to do. What is that is? You remember you found out cost of debentures. Cost of debentures. How did you find that? Approximation method only. What is that? Interest into 1 minus tax rate divided by net proceeds. I had told you a simple way to remember that formula. Receipt divided by payment. Receipt divided by payment. Correct? Correct. Here, no, sir. Here you'll have to find something called, or rather, in fact, I told you ulta amount. Payment divided by receipt, not receipt by. Because interest is what for the company, it's a receipt or it's a payment. In fact, I told you payment divided by receipt. Correct, no? Now, what you'll have to do is, let's say, or maybe I'll tell you with number. Let's say when you, due to factoring arrangement, you got a benefit of 2 lakh. Total benefit due to factoring is 2 lakh. The total cost due to factoring is 3,50,000. Total cost is how much? 3,50,000. That means this factoring is giving a net annual benefit or net annual cost. Net annual cost. How much is that? 2 lakh minus 3,50,000. How much is that? 1,50,000 is a net annual cost due to factoring. Yes, sir. Correct, people. So that means it is what? Benefit is greater than cost or benefit is lesser than cost? Sir, if benefit is greater than cost, you will simply accept. Here, benefit is lesser than cost. Now, you can't simply reject. You have to do one more step. What step is this? Very simple. Now, you need to calculate this. This is not a benefit. This is the cost. Remember, for creditors, you calculate annual benefit percentage. This is in value or this is in percentage. This 150 is in percentage or value? Value. Find this in percentage. You have net annual cost. Find out the net annual cost ka percentage. Find out net annual cost ka percentage. Very simple. Payment divided by receipt into 100. How much are you net mein? How much are you extra are you paying to the factor? 1,50,000. How much the factor is giving you? How much the factor is giving you? 3,28,000. That's a receipt by factoring arrangement. Factor is giving you how much? 3,28,000. Actually, the number is a little big, but anyway, no problem. Or let's make this maybe instead of 3 lakh, let's maybe make this as 10 lakh assumption. Make this as 10 lakh. Factor gave you how much money? 10 lakh. How much is the net cost you are giving to the factor? 1,50,000. So how much is the percentage? The payment is 1,50,000. The receipt is 10 lakh. If you do it, how much are you getting? 15%. Correct? Correct. That means due to factoring arrangement, you are incurring a cost of 15% on an annual basis. Because all this number you took on what basis? All this numbers you have taken on an annual basis. I mean, this 15% is what, sir? Annual cost of factoring. Okay. Now, you can't reject this factoring straight away. What you have to do is check. When you are doing a factoring arrangement, what will happen? You will get the money later on or today? Today. That means it's like a loan for you. It's like a loan. Sir, if you don't, now I need the money. Sir, if I need money, I have 2 options. What is 2 options? One, I can take a loan or I can do factoring. If I do factoring means how much it is costing me? 15%. I went to the bank and told I need a loan. Banker told no problem, macha, just for you 19.5%. For you, you are our macha. So for you, just the interest rate is how much? 19.5%. Now what you will do? Sir, if you go to the bank, the cost is 19.5. If you go to the factor, cost is only 15%. Reject or accept factoring. Accept the factoring. That's what it is. Okay. If you get benefit due to factoring, straight away accept. If you get cost due to factoring, express the cost first in percentage. Compare this factoring cost percentage with bank loan. If factoring ka cost is lesser than bank loan, accept factoring. Otherwise, reject factoring and go for bank loan. This is what one extra step you have to do. And to find out this cost percentage, we simply take payment divided by receipt. What is the net payment are you paying the factor? That only we call it as net annual cost divided by receipt. Receipt is how much money the factor gave it to you. That if you do, it means you will get the annual cost of factor. That's all it is. Okay, sir. This we will apply to you in the one next question. Can we do it? Everybody cool? Okay, sir. Papa. Okay, next question is which question number? I think there's a case study question in our study material as well as in our class notes. One case study question I see I had asked this factoring arrangement. So let's review this question. 10 more minutes. Okay. Concept is done. One application of factoring question. If you feel now I have got it, I'll move on and then I'll leave it. It's okay, sir. We will do it. Move on. Huh? No, sir. We will do, sir. Online also. Still there? Yes, sir. Okay. NV Industries is a manufacturing company. That is their problem. We don't need that. Total sales ledger is how much? 200 lakhs. Sir, we need factoring is an arrangement where we sell debtors. Debtors will come through total sales or credit sales. Total sales is 200 lakh. 80% of that is credit sales. That means credit sales number will be how much? 200 lakh ka 80%, which is 160 lakhs. Company has a credit policy of 2/40 net 120. That means what it means? 2% discount if paid within. If debtor pays us within 40 days, we will give 2% discount. Otherwise, debtor must compulsorily pay within 120 days. That's a credit period given. Past experience of the company shows that on an average, 50% of the customers avail the discount. 50% go for the discount. Balance receivable are collected in 120. Obviously, others don't go for discount means they will ideally pay within 120 days. That means, tell me, sir, what is your average collection period currently? Currently, what is our average collection period? 120. No. Sir, 120 days is a collection period I'm giving to the customer. Is everybody going for 120 or 50% of them are going for discount? Sir, if 50% of them are going for discount means they have to pay me within how many days? 40 days. 100% will pay or only 50%? So 50% of them will pay us within 40 days. That means I will collect on an average from them 20 days. Within 20 days, I will collect. The balance 50% of them will pay the money within 120 days. So on an average, my collection period, if you add, you'll get how much? 80 days. Currently, before my factoring, my ACP, as in my average collection period is 80 days. This is okay. I need this. Yes, everybody. Because I have to calculate opportunity cost. Opportunity cost will come, or rather, that opportunity cost will come if there is any reduction in average collection period. Currently, my average collection period is 80 days. We don't know. We'll see. Yes, people. Okay, now check. Next is what the finance controller estimated that the bad debt loss is 1%. Let's do a thing. Is it okay? As in when we read the data, we will punch the numbers in our format. What is our main format? Main format. We are evaluating factoring proposal. When you are evaluating credit proposal, we want benefit and we want cost. Right? To find interest, we are putting up a working note. That is the sales format. But the main format is what? We are trying to find out the evaluation of credit policy here. We have to take all the benefit and we have to take all the cost and find out whether it is a net annual benefit or net annual cost. Okay, first one, let's identify. First May, they told, what is our credit sales? 160 lakh. How much is the, sir, bad debts will come on total sales or credit sales? Credit sales. Credit sales is how much? 160. Currently, my bad debts is how much? 1%. So calculate 160 lakh ka 1%. How much? 1,60,000. Correct. This is what? Benefit for me or cost for me? This is a benefit for me or cost for me? Sir, currently it is a cost. But now I'm thinking of doing a factoring arrangement. Now I'm currently planning to do a factoring arrangement. After I do you want me to read the question or is it okay? We'll review like this only. It's okay, no? After I do the factoring arrangement, bad debts is on my head or I passed it to factor? Because we always assume that factoring is done on a without recourse basis. That means this bad debt I will incur or I will save. That means this is what? Savings. This is a benefit. How much is the benefit due to savings and bad debts, sir? 1,60,000. That is the first savings we have got. Easy, easy, easy. Okay, this is done. Next, we will read the next one. Next data, what have they given? With escalating costs associated with in-house management of the debtor coupled with the need to unburden your full goalies, they've given. CFO is examining the possibility of outsourcing its factoring for managing receivables. Now they are thinking, let's go for factoring. Okay, that's all is a drama. Currently, firm is spending how much money to administer credit sales? 2,40,000 per annum. On an yearly basis, they are incurring an administrative cost of 240. Because why? They are managing what now? Credit sales. Now, should we have to administer this or factor will do it? So, this cost we have to incur or we will save? Save. They will mention also. See, these are avoidable as factoring firm is prepared to buy the receivable. I mean, this cost we have to incur or we can avoid. By factoring, we can avoid this cost. Even if the sentence is not given, we will think that we can avoid this cost only. I mean, this 240 is what? Cost or benefit? Benefit. So, this 240 is again my benefit. Savings and administrative cost 2,40,000. Two benefits I've got. Next, what is the next one? No. Here. The main elements of the factoring proposal are, factor will charge 2% commission. 2% commission. Sir, what is my credit sales? Because I am going to sell my debtors. Debtors will come through total sales or credit sales? Credit sales. What is my total credit sales? 160 lakh. What is the commission? 2%. 160 lakh at 2% you do. How much? 3,20,000. So factoring commission on an annual basis is 3,20,000. Okay, Saru? Okay, 3,20,000 is a benefit or cost? Cost. So this, due to this particular proposal, we'll incur a factoring commission of 3,20,000. Credit sale multiplied by factoring commission. Got it? Okay, G. This is also done now. Next, what have they told you? It will pay, the factor will pay an advance against receivable at an interest rate of 18%. So factor is charging any interest? Yes. At what rate? 18%. So this 18% will be always per annum basis. After withholding, 10% as reserve. Is reserve there? Yes. How much? 10%. That means we have to calculate interest. For interest calculation, we have a separate working note. Can we do that working note? Or tell me that recap of that working note? First, we will take annual credit sales. Will the factor give the full amount or he will withhold? How much withholding? 10% reserve, you reduce it. Will he give this amount or he will also deduct commission? Reduce commission. You will get amount available for advance. On that advance, factor also will charge some interest. At what rate? 18%. Have they told after factoring collection period has become 45 days or anything? Any mention or no mention? That means you will calculate the interest for 80 days. Thinking that factor also will have an average collection period of 80 days. That Gunda is of no help. I am also Gunda, he is also Gunda, same Gunda cancel. Okay. I also used to collect the money from debtors within 80 days. Factor also is collecting the money within 18 days. That means for factor, money is getting blocked for how many days? 80 days. So you will calculate the interest for 80 days. Can we do this now quickly? Okay. How much is, take the number now. How much is credit sales? 160 lakh. This is a format. Now I hope a little better for everybody. 160 lakh is annual credit sales. Will the factor give this or reduce the reserve? Reserve. How much reserve? 10%. So reduce 10%. 16 lakh. This much, or he will reduce commission also. Commission. How much is commission? 3,20,000. So reduce 3,20,000 commission. How much is the amount available for advance? 1 crore 40 lakh 80,000. Will he give this amount or interest is there? Calculate the interest. 1 crore 40 lakh 80,000 into 18% interest for an average collection period of 80 days. Calculate. 1 crore 40 lakh 80,000 into 18% into 80 by 360. If you do, annual interest you will get is 5,63,320. Numbers are looking fine. Okay, sir. That means will factor give us this much money or he will reduce interest also? Reduce interest. That means how much is amount? 1 crore 35 lakh 16,800. But hang on. How did you arrive this 1 crore number? By keeping annual credit sales. Are you selling sales to your factor or debtors to your factor? Sir, will you give whole your credit to your debtors or 80 days? 80 days. This particular number is for 365 days. But are you giving 365 days credit to your debtors or 80 days? 80 days. That means you need to prorate. Okay. So 1 crore 35 lakh 16,800 is for 360 days. I think because question 2 asks us to take 360 days. Somewhere they must have told. Consider 1 year as 360 days. That means you have to do all your calculation instead of 365 at 360. So this 1 crore 35 lakh 16,800 is this number based on debtors or it's based on sales? This particular number, sir, you arrived this number by taking debtors as a value or sales as a value? Sales. Are you selling sales to your factors or debtors to your factor? Debtors. So this particular number is based on sales. Factor will give the amount not based on sales. Factor will give the amount based on debtor. So prorated. 1 crore 35 lakh 16,800 is a number for 360 days. Will you give 360 days credit to your debtors or only 80 days? 80 days. Into 80 days you do, you'll get how much? 30 lakh 3,733. That's the number. Okay, people. Understood, people? Okay, this is the amount of advance given by the factor. Now you got interest also. How much interest you got? 5 lakh 63,200. So interest is a benefit or cost? Cost. Okay, now that's it. Now evaluate. No other things I think are there. We can go back and check also once. Where is it? Okay, now they have given long-term loan. Instead of factoring, if you take a loan, it will cost how much? Long-term loan will cost you 15%. Working capital loan will cost you 14%. That we will see. And last analysis, maybe we will see. Now, we got all the benefits. Sir, there are 2 benefits. Sir, due to factoring, is there any reduction in average collection period? No. We are collecting 80 days. Factor also is collecting in 80 days. So should we have to consider any opportunity income or not required? Not required. 2 benefits. If you add, how much is it? 4 lakh. Okay. All these benefits are on what basis? Annual basis. So annual net, the annual benefit or annual saving is 4 lakh. Okay. Similarly, factoring, does it have any cost? Yes, it has couple of costs, commission and interest. Interest we calculated here. How much is that interest? 563, 200. Calculate that. Sir, add these two. These two are your cost. Adding these two, what is your cost? 883, 200. Sir, benefit due to factoring is 4 lakh. Cost due to factoring is 883. That means this factoring arrangement, is it giving you net annual benefit or net annual cost? Net annual cost. So these two come minus you do. You're getting net annual cost. So net annual cost means reject or calculate percentage. Calculate the percentage. How do you get the percentage? Simply payment divided by receipt. How much are you net mein, how much are you paying the factor? 483, 200. And how much is the factoring giving you? Factor is giving you an advance of 30 lakh 33. Okay. It's like this. Factor is giving you a loan of this much amount and he is charging you this much amount. Now you need to express the amount. Okay. Payment divided by receipt. So net annual cost you take, which is this, divided by amount advanced by the factor you do. So 483 divided by 30 lakh something you do. How much are you going to get? 16.09%. I think factoring is not a good proposal. No? Because net factoring cost is how much? 16%. If you want a long-term loan, you can take a long-term loan from the bank only at 15. I think for debtor, we don't need a long-term loan. Debtor is a long-term arrangement or working capital arrangement. You can take a short-term working loan from the bank at 14%. Factoring is costing us 16%. Working capital loan is only costing 14%. That means which is better, factoring or loan? Loan. They have not asked suggestion. Here they have given MCQ question. Okay. That and all they have asked. That's okay. I mean, anyway. That only, whatever you have solved, only one part they will ask and you need to select. Okay, sir. This is the collection. Way of calculating. Explain average collection period. This you want me to explain once again. Huh? This one, huh? Yes, okay. Simple. Sir, to get the debtor, to get the discount, debtor should pay within how many days? 40 days. If the debtor doesn't want discount, he can pay us within 120 days. I mean, there are two options. Either you can pay within 120 days or the debtor can pay us within 40 days. These are the two options. Okay. Now, every debtor is going for one option or they're split? Split. They told in the problem 50% of the debtors go for discount. Another 50% is going for discount or no discount option. So 100% of them are going for this or only 50%? 50%. That means on an average, this particular customer I will recover the money within 60 days. And other 50% is paying me within 40 days. That means this collection days is how much? 60. So if you add these two, you will get the collection period of 80 days. That's all it is. Okay. Take the thing and multiply by the respective probability percentage. Now better, that's it. Okay, sir. Now, if you want, just for your reference, some of them ask about the ICI presentation. Okay, this went off here. Alright, it's not come here. 1 minute. It's not loading here. Yeah, I'll have to calculate once again. Or 1 minute quickly. I'll take the number and do it here. The number went off. Don't know why it's not copied here. Is it okay? You want me to show the ICI presentation? I'll see. If there's too much, I'll just take it. New problem, new software, new question, new worries. Okay, or okay, fine. If not, if you want, I can just prepare that also 2 minutes quickly. Now, sir, how ICA presents this? Now, how are we working out amount advance from factor? This everybody got it, no? If you lead to confusion, I'll not explain this. If you want 2 minutes, once more. Like enough, Paka. If you don't want, I'll not go for it. I copied it, somehow it didn't come only. That's the reason I'm doing it. If you want, if you feel enough. What is it? I have not used this approach in my class, but some ICA use this approach. Another way to calculate the same. This particular 30 lakh, no? Here this number is there, right? This one you can calculate in another way. That's all. It's also easy only, not difficult. You're not answering. Okay, I'll do it just in case whoever wants to do it will do it. Okay, this approach is very straightforward. In our approach, what are we doing? In our approach, what are we doing? Sir, we are taking sales. We are taking sales and arriving the debtor value. We are arriving the debtor value. So in a way, we are going like this. ICA is saying, why are you doing so much harkat? Directly take debtors. Because do we sell sales to the factor or debtors to the factor? First only you find debtors, no? Why are you taking sales? Why are you taking sales? First only you find debtors. So how much is annual credit sales? 160 lakh. Annual credit sales is how much? 160 lakh. Oh, 1 second. 160 lakh is annual credit sales. That means this 160 lakh is for 360 days. Correct? Are you giving 360 days credit period to your debtors or on average 80 days? 80 days. Calculate. I'll copy the number from here. How much is this? Mike, I have the written number I have written is showing 35 lakh 55 555. Correct? Huh? Yes, people. This, because you will not sell the sales to your factor. You will sell what to the factor? Debtor. How much is the debtor? 35 lakh. This is what you will sell to the factor and recover the money. Correct? Huh? But will factor give full money or reserve? Reserve. So reduce the reserve. How much is the reserve? 10%. So 35 lakh 55 ka 555 ka 10%. If you do, that will be 3 lakh 55 555. This much reserve factor will first reduce. Okay, G. Yes, sir. He will pay this amount or deduct interest also. Interest also. Reduce interest also, G. How much, Saru? Or in fact, interest. First, in fact, there is factoring commission also. No? There is factoring commission also. So calculate the factoring commission. Okay, commission. Sir, how much is the debtor we are selling to the factor? 35 lakh 555. And how much commission is the factor charging us? 2%. So calculate all the amount, not on sales now. Calculate everything on the debtors value. That's it. So calculate this. How much is it? My number is showing 71,111. You calculate. I don't know. I would have done the calculation urgency. Are you getting the same number? Okay. By doing this, what you will get? You will get amount available for advance. Amount available for advance. By subtracting, I have written 31,28,889. You are also getting same number, huh? Yes. But will factor give this much money or he will reduce interest also? Reduce interest also. Calculate. How much? 31,28,889. And factor is charging an interest at the rate of 18%. But 18% is for the whole year. Is factor ka money getting blocked for whole year or only 80 days? So that means into 80 divided by 360 you do. How much is that? My calculator is showing 1,25,126. Yes, sir, people. Yes, sir. Finally, after deducting everything, factor will say, Chumantar, take how much? Amount advanced by factor. Oh, I have gotten 30 lakh 3,007 or 30 lakh 3,733. Okay, sir. This is what ICA presents. This also, if you want, you can follow. But unfortunately, I had explained this method in all our class 8-10 problems. So I thought I'll revise using this method only. But if you want, you can follow this ICA presentation also. Sir, whether you do our method or ICA method, final answer will be any which way. Just the only difference is we start with sales first. Okay, then get the debtors. They start with the debtors only first and then get debtors only. One advantage of our method is why I didn't do this method in regular class, why I stuck to that is, sir, when you get net annual cost, right, will you reject the factoring proposal or compare it? Compare it with what? Bank ka loan. Bank loan ka interest rate will be for the factoring period or whole year? Whole year. But unfortunately, this commission, this interest and all, no, is not for the whole year. It's only for 80 days. If you follow this method, no, you'll have to annualize them. Meaning 71,111 is the commission for 80 days. How much is it for? 360 days. You need to convert that or annualize this. And then only evaluate factoring proposal. I thought let's anyway, why to do that? That's the reason I first annualized them and did that. So I say also in a way is going like this now. First they went like that, then they realized, that's it. Either ways, whatever you do, some jugad you'll have to do under any of the methods. Understood, everybody? So once again, if you want, I can explain this. What is this now? 71,111 is the cost for whole year or factoring period? 80 days. But we want, bank loan is not for 80 days. Bank loan ka interest rate is for 80 days or whole year. That means we need to calculate factoring cost not for 80 days. We need to calculate factoring cost for the whole year. That means first annualize this. This is the cost for 80 days, means for whole year, how much is the cost? When you calculate, how much you're going to get? Then you calculate, prorate this, how much you're going to get? 3,20,000. What did we get here? 3,20,000. One and the same. So both the factoring commission as well as the interest you need to prorate. Same goes for the interest also. How much is the interest we got here? 1,25,156. This is the interest for how many days? 80 days. We want 80 days interest or whole year ka? Whole year ka. Yes, people? So do the whole year. Okay. When you prorate it, how much you're going to get? 125, 156 into 360 by 80. If you do, you'll get how much? 563, 200. What did our method give us the interest? 5,63,200. Final answer will be the same. Okay. In ICA method, take the debtors. But if you take the debtors, all the cost you need to annualize. And then do the evaluation. Otherwise, if you use our method, the class method which we followed, annualizing is required or we already annualized. Because since we worked out by taking annual credit sales, we don't have to annualize. We already have all the numbers on annual terms. That's all as a distinction. Whichever method you do, you'll get the same answer. There's all roads lead to Rome only. Okay, same answer. That's all is your packetering at a cost. They have given MCQ question, but this is all is a funda. Clear. Okay, one last thing, then over. Enough, sir. Hey, wait. One ton committee is there. Tandon committee. Okay. That Tandon committee, I don't know why they brought it in here. This is relevant for banker. Yeah, this is relevant for banker. Sir, we are giving loan or we are taking loan? Taking loan. That means, should we analyze the things from bank's perspective? Tandon committee, they told how much working capital loan banks should give to the company. Sir, we are doing this chapter from bank's perspective or company perspective. I mean, should we worry about how much loan bank should give or irrelevant? Irrelevant. But unfortunately, this also somewhere they put in our syllabus. Or maybe they removed it now, I am not sure. Okay, but anyways, 2 minutes, I'll quickly cover. The Tandon committee, they told banks should give the working capital loan, okay, under 3 methods. Under one of the 3 methods. Method number 1 says it's all 75%. Okay. First, the bank should give a loan of 75% of net working capital. 75% of net working capital. How do you get net working capital? Current as first, bank should calculate current assets of the company and reduce current liabilities of the company. You will get what? Net working capital. Of the net working capital, we have to calculate 75%. That is the maximum permissible banking finance. That is the maximum loan a bank should give to the company under method number 1. Okay. Second method, little more strict too. They say first find 75% of current assets. 75% of current assets. From that you reduce current liability. You will get one limit. That is the loan you will give under method number 2. Third is even more stricter. From the current asset, reduce core current asset. Core current asset means some companies will maintain per buffer stock. No matter what, some stock they will always maintain. No matter what, some cash balance they will always maintain. That means it is working capital or it looks like a permanent working capital. If it's a permanent working capital, should bank fund that or company should fund it? Company should fund it. So that is the idea behind this method. If you from the current asset, core current assets or permanent current assets, whatever you have, you reduce that. You reduce that and then calculate 75% of that number and reduce current liability. You will get this number. It will be given to you. What is CCA? Core current assets ka value and all will be given to you in the question. So 3 methods will give you a different value. So which method should be adopted? Based on the credit risk of the company, banks will either finance under method 1, method 2 or method 3. We just need to calculate all the 3 methods and give it in case the question comes. Okay. All the data will be given. You just need to apply this if in case it pops in. There's another type of question. If they want, they can ask. Yes, people. So with this, finally, working capital management we have completed. Thank you for your time and patience. Hello, people. Welcome back after that wonderful support break. So now we'll be taking up the FMRTP, Financial Management ka RTP May 2025 review we shall be doing. Overall, some good questions has been added. Some 4-5 good questions has been added in this RTP. So I would rate this as a pretty good, better RTP comparatively from ICA this time. Okay, so let's see and review what we can learn from this particular RTP questions. So first question is a case question based on investment decision. So Linty, small space company, blah, 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 and all we don't need. We'll go into the matter. They want to purchase a new automatic machinery and they have 2 alternatives. Either they can buy machinery 1 or machinery 2. 2 options are there. Okay. And both ka life is 10 years. Fine. They have given some data. First machinery will cost 45 lakh. Second will cost 50 lakh. If you go for first machinery, you will save wages of 15 lakh. Second one will save wages of 20 lakh. That means this is what, sir? Inflow, right? Similarly, estimated savings in scrap we have to the extent of 5 lakh and 6 lakh. Again, this is an inflow. They have given you various data. Let's first categorize them as an inflow or an outflow. Because for investment decision, we need profit or we need cash flow. Cash flows are categorized into inflows and outflows. Now, estimated additional cost. Cost means inflow or outflow. Outflow for machinery 1 and 2 they have given. Great. Next, estimated additional cost of indirect labor. Again, this is an outflow. Then estimated cost of repairs. Again, outflow. But one cost they did not give, which is a depreciation. That one hidden information we need to do it. So few inflows and few outflows they have given. as a case. What is the requirement? Depreciation is done under straight line method over the useful life. That means what will be depreciation? First asset ka cost is 45 lakh and the life is 10 years. So that means the depreciation for first, there's no value. So how much is that now? For how much is that first? Okay. We'll do it, or maybe we'll review that little later, leave or else. Straight line method ka useful life, you need to charge depreciation. Company ka tax bracket is 35%. Return expected is 15%. What is the ask? They are asking you, they've given a case and multiple MCQ questions has been asked. What is the annual savings from machinery 1? Savings from machinery 1, indirectly they're asking you, it is the PAT, profit after tax. That's what they mean by annual savings. Annual savings of PAT of basically machinery 1 and machinery 2 is what they're asking. Okay, that's what we need to figure it out. Can we do it quickly? Okay, first one is, excuse me, or I think this we will quickly review. So how do you get profit after tax? Basically inflows minus outflows you need to do. You will get profit before tax. From that you reduce tax, you will get profit after tax. So take a calculator. First inflow is what, sir? We'll do it one I'll do, machinery 2 you can manage. There's nothing, there's actually a repetitive question. So savings is how much, sir, here? For 15 lakh. Here again a benefit of 15 lakh. 15 plus 15 you do. How much is that? 20 lakh. 20 lakh minus 2 lakh. Then minus 1.5 lakh. Minus 4 lakh. You do that. How much are you getting? 12 lakh 50,000. So far we have got it till here. That's what we got it here. That's what, this is the data given to us in the question. Now the depreciation you need to take. What is the cost of the first asset? Cost of the first asset was 45 lakh. Life of the first asset is how much? 10 years. So 45 lakh divided by 10 you do. How much is that? 4 lakh 50,000. So that is a depreciation, reduce it. Okay. From profit, from this one, if you reduce depreciation, you will get profit before tax how much? 8 lakh. Tax rate is 35%. Reduce that. You will get profit after tax how much? 5 lakh 20,000. Okay, Saru. Now for investment decision, we need profits or we need cash flow? Cash flow. After PAT, we'll do 6 adjustments. What are those 6 adjustments? Add back depreciation, add back salvage value, and then opportunity cost, working capital, additional investment, and short-term capital gain or loss if it is there. All that information is not there here. Only one thing is there, which is what? Depreciation. You'll get what? Annual cash inflows. Okay. First answer to first MCQ question is they asked what is the annual savings. So that is what, sir? What is the answer? Basically 5 lakh 20,000. What is the, in fact here, what is that? Annual savings means PAT. What is the PAT for first option? 5 lakh 20,000. That's all is what they're asking. Easy. Okay, everybody, fair enough. All right. Okay. And don't here 1 minute, 1 second, maybe one more I'll tell off here. Okay. Don't reduce this. Okay. This is not scrap. This is what, sir? This is not your salvage value. Some people take 45 lakh as a cost of the asset, reduce the salvage value 5 lakh. This is what? This is what savings in scrap per annum. Scrap means when you use old machinery, you will generate some waste. You will generate some waste. That when you buy a new machinery, is that waste will come or waste will get saved? That they are asking. This is not asset ka salvage value. This is not asset ka salvage value because this is on a per annum basis. Salvage value you will get every year. No. In fact, salvage value is given in this problem or not given? Not given. That's what they're trying to say here. Okay, people. That is the answer. For machinery 1, I have done. Same format you can do it for machinery 2. So I will focus more towards the new questions here. Okay. Repetitive quickly we will review. Okay. That's the answer to the first MCQ question. Okay. Next, they've asked a payback period. Payback period. All you need our help. How do you get payback period? Initial investment divided by annual net cash flow. In this problem, one good thing is net annual cash flow is changing every year or same every year? Same every year. How much is that cash flow we got? Cash flow we got it after adding back depreciation. We got 9 lakh 70,000. This is your denominator. How much is your initial investment for first machinery? 45 lakh. 45 lakh divided by 9 lakh 70,000 you do. Payback period is how much? 4.63. Okay, sir. Very straightforward. Next, they've asked ARR. Sir, how do you get ARR? Quickly tell in formula. You will take PAT. In fact, PAT or you will take average PAT. Average PAT. But anyway, here profit after tax any which way is same every year. That means that profit every year itself becomes what? Yeah. That only becomes your average PAT. In fact, formula you can write average PAT divided by what, sir? Either you can take initial investment or average investment. Check the MCQ option. They would have solved either using initial investment or they would have solved using average. I think in this problem, they have solved using average investment. First, you try using initial investment. If you don't see any option, then solve using average investment. You will find it. Both will not be given. That will be controversial. Okay. So if at all they give, you'll give extra marks. Grace marks will be given in that case. Okay. So do you know average PAT? Yes. What is that PAT, sir? Profit after tax is 5 lakh, 20,000. So that means what is your average investment? How do you get average investment? Half of initial investment minus salvage value plus working capital. Here salvage value not there, working capital not there. That means initial investment only you will have to divide by 2. What is the initial investment for machinery 1? 45 lakh. 45 lakh divided by 2 you do. How much you going to get? 22.5 lakh. ARR is a return. So multiply by 100. So how much you going to get? You'll get 23.11%. This and all is a question, sir. For your standards, all these are what? Nothing. Yes or no? Okay. Next question they have asked is profitability index. How do you get profitability index? Present value of cash inflow divided by present value of cash out. Here cash inflow is changing every year or same every year? If it is same every year and useful life is 10 years. If it is same every year, will you use PVIF or PVAF? PVAF. What is the annual net cash flow for machinery 1? Just now we got 9,70,000. Discount factor they have given at 15%. So 15% ka we'll use PVIF or PVAF? PVAF. This way you will get present value of cash inflow. How much is that? 48,68,430. That is the present value of cash inflow divided by present value of cash outflow. For machinery 1, the outflow is 45 lakh. You will get profitability index of 1.08. That's all. Done, people. So quickly reviewing. This is a repetitive question. Nothing much. In fact, this is literally homework only. There's nothing new in this. Yes, sir. So this is the case-based question that they have asked for the first one. Can I move forward to the next? Okay, second question. This is also repetitive since it's an MCQ question. Quickly, I'm doing it. That's all. Okay, shares of ACB company. It's presently traded at 51. So that the current market price of this is how much, sir? 51. That is your P1 or P1 or P0? P0. The company is expected to pay dividend. Dividend already paid. We call it as D0. This is expected to pay means this is D1. Okay, D1 is how much? 5. Growth rate they have given it to be 10%. Okay. It plans, the company wants to raise new equity shares. They need some money maybe. Okay. The merchant banker has suggested that the underpricing of 2 rupees is necessary. That means are you planning to issue new shares at higher value or lower value? Underpricing means you are issuing it at lower than market price. What is the current market price? 51. Are you planning to issue it at 51 or 2 rupees lesser? That means issue price is how much? 49 rupees. Okay, sir. All right. And besides this, it involves a cost of 50 paisa per share as miscellaneous expenditure. To issue this shares, we have to incur 50 paisa rupees as cost. This only we call it as a flotation cost. How much is flotation cost? 0.5. Okay. Issue price is 49. Flotation cost is 0.5 means what is your net proceeds? 48.5. Correct? No. The moment it is growth rate, we will use Gordon's formula because Gordon's only rate where we use is the growth rate. What are they asking you? They're asking you cost of new shares, cost of new equity shares. That means they're asking you cost of equity. That too using Gordon's growth model. Tell me what is the formula for cost of equity? Either you'll use D0 or you'll use D1 depending on information. What have they given here? D1. So the formula will be D1 divided by P0 minus flotation cost, whole thing added by growth rate. D1 is given to be 5 minus P0. P0 could be issue price. If it's a existing debt, first priority you will give it to market price. If it's a new instrument, your first priority you will give it to the issue price. So P0 here becomes your issue price. What is the issue price? 49. 49 minus flotation cost you do. So that means our net proceeds will become 48.5. Whole thing added by the growth rate. What is the growth rate, sir? 10%. Do that, you will get 20.31%. So D for Delhi is the right option here. Any problem in this question? Pretty straightforward this also. Yes, sir. Okay, move on to the next question. Leverages. Online also till now, there are no people, no issues. Can I carry on? I hope I can maintain this pace if it's a repetitive one. Correct? No, nothing new. Yeah. For the new ones, we will go a little slow and try to learn them. So one company is there. Their operating leverage is 3. Sales level is 7 lakh. Operating income means what, sir? EBIT. Okay, their EBIT is 2,20,000. Okay, now they are saying sales has fallen. Fall in sales is how much? 10%. Sales is reduced by 10%. They are asking you what will be fall in sales of company by 10% will result in decrease of operating income. Operating income is EBIT. Sir, they're asking you how much EBIT will fall. How much EBIT will fall. Now, simple. Which leverages measures the relationship between sales and EBIT? Sales and EBIT is measured by operating leverage. Okay. Now, they have already given operating leverage is 3. Sir, if operating leverage is 3 means for 1% change in sales, there will be 3% change in EBIT. Correct? That's what operating leverage measures. Here there is 1% change in sales or 10%.
10%.
That to 10% ka increase or 10% ka decrease. If sales is reduced by 10% means operating income will reduce by thrice of that, which will be how much? 30%. So 10 ka 30% you do. How much is that? I mean, rather 10 ka 3 becomes 30%. So operating income will fall by 30%. Currently, what is operating income? 2,20,000. Operating income will reduce by 30%, which will reduce how much, sir? 66,000. They did not ask you new operating income. They asked how much operating income ka impact. What will be the impact in operating income? It will reduce by 66,000. So that's the option you need to select. So if they ask you new EBIT, what will be the new EBIT? It was at 2,20,000. It will reduce by 66,000 and it will become how much? 1,54,000. If they ask you new EBIT, then you will select 154 as the option. They asked what will be the impact, what will be the decrease in operating income. Operating income will decrease by 66,000. So hence that is the right option you need to select. Fine now people? Straightforward leverage wala question. Done. Okay, next question is on ratio analysis. Good question. I'll keep this as an LDR. Last day revision. Okay, I've given you in the regular class a lot of LDR questions. You can add this question also to your LDR list. Okay, now let's see what we can learn from this question. From the following information below, prepare the balance sheet. You need to prepare the balance sheet. So ratio analysis, usually from ratio they'll ask you balance sheet. For leverage they will ask you income statement. That is examiner's favorite way of testing these sort of questions. Okay, stock turnover ratio. Sir, keep telling me the formula so that it becomes a recap for us. How do you get stock turnover ratio? COGS divided by either you will take average stock. If average is missing, then you will take closing stock. If you quickly review the data, have they given you 2 years data or only 1 year? Both are amounts. Both are amounts. That means they've given only 1 year data. If they've given 1 year data, can you take average stock or probably closing stock? Probably closing stock. Fine. Then cash balance, they are saying 10% of current assets. Whatever is your current assets, 10% of that is your cash balance. But this current asset should be net of prepaid expense. That means prepaid expense should be considered or it should be netted off. Netted off means you should first reduce. From the current assets, you should reduce prepaid expense. Of that, 10% will constitute cash and bank balance. That's what they are trying to say. Okay, G. Alright, GP ratio is 20%. 20% of what? Sales. Sir, if GP is 20% of sales means COGS will be 80% of sales given. Okay, fine. Creditors turnover ratio. Normally, how do you calculate creditors turnover ratio? Annual credit purchases are divided by average accounts payable or closing balance of accounts payable. But here they told creditors turnover ratio is based on COGS. That means the formula will be credit purchases or COGS. COGS divided by creditors. You can take it. Or you can take accounts payable. Fine now? Alright. Next, debtors turnover ratio is 12. How do you calculate debtors turnover ratio? Annual credit sales. Annual credit sales are divided by either average debtors or closing balance of your debtors. One of the information. That's how you get debtors turnover ratio. That is given to be 12. Next information check. Net fixed asset is 25% of total liabilities. Fixed asset is a net fixed asset. That basically the closing balance. Net means what, sir? After reducing depreciation. Before depreciation, it is gross. After depreciation, fixed asset only we call it as net. Okay. After depreciation, fixed asset ka value will be 25% of total liabilities. So we know this. Total liabilities and total assets will be different or same? If fixed asset is 25% of total liability means indirectly it is also 25% of total assets. Correct? Yes, no? So if fixed asset is 25% of total assets means current asset will be 75% of total assets. Okay, probably we may have to take this help and solve the question. So whenever it comes, you need to think how and all the linkage is being established. That way it will help you to solve the questions faster. Depreciation is 15% of the opening balance. Opening WDV ka 15% is your depre for the current year. Fine. Current ratio is 1.6:1. That's as good as saying current ratio is 1.6. Capital gearing ratio. So how do you get capital gearing ratio? Gearing ratio means what? Using fixed cost instrument to increase equity ka return. So what are the fixed cost instrument? Preference share capital plus debt divided by equity you can call, or you can also call it as net worth. Okay, that is given as 0.6:1 means it's indirectly nothing but 0.6. We'll see where you can use this information. This is what they've given. All the purchase and sales are on credit basis. Even if they don't give, we will make the same assumption. Now balance sheet ka format they only given. Okay, now check. In some components of balance sheet they've already populated. Share capital is how much? 36 lakh given. Reserves in surplus and 14% bond. We don't have preference share capital. We have only bond. And this bonds carry an interest rate of 14%. Both are missing and total is also missing. This only we call it as, this number only we call it as capital employed. Correct, no? Capital employed means all the source of finance put together. Correct, no, sir? Yes, or no? Yes, sir. Okay. Sir, current liabilities, trade payable missing, outstanding expenses also missing. But they told, check, they have given what? What is this? Total current liability is given. Awesome. Why? Sir, they have given you current ratio. They have given you current ratio. How do you get current ratio? Current assets divided by current liability, and current liability ka value given. That means using this you can find out current assets. Using current assets you can find out total assets. Using total assets you can find out fixed assets. And then accordingly you can also find out depreciation. Linkage. Understood? This is the way. You have to find. One false means automatically everything will fall. But you need to identify which component to find out. Okay, everybody? Done. This is done. Next. But 1 second, hang on. This 45 lakh is net of prepaid expenses. Weird adjustment. But anyway, we can't question the question. Sir, prepaid expenses should be shown under current liability. Yeah. Sir, prepaid expense is part of what? Current assets. But what have they done? This 45 lakh is after netting off prepaid expense. Netting off means adjusting. That means is the value of current liability really 45 lakh? No. This 45 lakh is after reducing prepaid expenses of 7.5 lakh. Because prepaid expense is current liability or current asset. One component of current assets they have reduced it. So ideally crazy adjustment. Will you show prepaid expense under current liability? Yes, sir. But anyway, can we do anything about it? I say wanted to construct some different question. They brought in of this. What to do? I mean, is current liability really 45 lakh? No. 45 lakh is after reducing prepaid expense of 7.5. That means actually current liability is how much? 52.5. Okay. But yeah, this is what it is. Manageable, everyone. Alright, next what did they give? Fixed assets ka opening balance and depreciation we need to find out. Closing balance also you need to find out. Current assets also. Current assets has these three components. All are missing. Total is also missing. I think we got. All working notes should form part of your answer. We got the track. What should we hold off? They have given you current liability. Using current liability, we will use current ratio and find current assets. Using current assets, we will find total assets. Using total assets, we will find fixed assets. At least that much we can do. Okay. Don't worry, in ratio questions, no, 1 or 2 adjustments will be newly framed. Entirely like this one. This is literally crazy. Correct? No. Prepaid expenses, who will adjust from current liability, sir? This is just for the sake of making the question little weird. These sort of adjustments are done. But absolutely no problem. At least if they've asked 5 things, at least 2 or 3 components, if you are able to find it, do it within time. Instead of 10 marks, if you at least get 5 marks, it is good. From a new question, even if you get 20 to 30% marks, you're still a good chance that you'll score exemption. So don't freak out. But be very, very careful about the time. Don't waste too much time. So when you read the question, if you feel this is totally weird, keep it at the end. First, whatever you know, first you solve. Now, can we start with this? Now, how much is the current liability, sir? I've already solved. Quickly, we'll review it off. How much is the current liability? In fact, current ratio we will start with. What is the current ratio given in the question? 1.6. How do you get current ratio? Current assets divided by current liability is 1.6. Therefore, current liability will be equal to what, sir? In fact, I can substitute only. How much is current liability? Current liability they have given in the question is 45 lakh. Is that the actual number or it is after adjusting prepaid expense? After deducting prepaid expense, current liability is 45 lakh. But what is the actual value of current liability? 52.5. Substitute. Current assets we don't know. Current liability is 52.5 is equal to 1.6. With this, you will get current assets to be 84 lakh. Any doubt in this number, anybody? I'll go slow on these questions. I'll keep asking. Online also, are we comfortable with this? Can I move on? This working note? Quickly go on telling so that I can move forward. Okay, now we know current assets. Now they told fixed asset is 25% of total liability, not me, question told. Sir, if fixed asset is 25% of total liability means is as good as saying fixed asset is total 25% of total assets. If fixed asset is 25% of total assets means current asset is what? 75% of total assets. Do you know current assets? Yes, current assets now is 84 lakh. Now current assets, you know, current asset is 75% of total assets. Can't you find out total assets? Yes. How do you find out current asset? How do you find out total assets? Current assets divided by 75%. Current asset is how much? 84 lakh. 84 lakh divided by 75% if you do, how much you going to get? 112 lakh. This is your total assets. Easy, people. Once more, or got it? Got it. And fixed asset is how much? 25% of total assets. Total assets is 112 lakh means fixed assets will be 25% of that, which will be how much? 28.5 lakh. Okay, people. Yes. Correct. Sir, total assets will come where? Total assets will come in balance sheet. Balance sheet you prepare at the beginning of the year or end of the year. That means this is the total assets at the end of the year. Using this, if you find fixed asset means you will get fixed asset balance at the beginning or at the year end. That means this 28 lakh is fixed asset ka closing balance. Because in this problem, they asked you fixed assets ka opening balance also, depreciation also, closing balance also. Yes, sir. Correct. So closing balance of fixed asset is 28 lakh. Clear? They told what in the problem? Depreciation is 15%. No, we read the data somewhere. What is that? Where is that? They told depreciation is how much? 15% of opening WDV. So the number that we got is opening WDV or closing balance. We have got the closing balance. Sir, it's like this. Sir, if the opening balance is 100 means, depreciation will be how much? 100 ka 15%, which is 15. That means closing balance will be how much? 85. This 28 lakh is opening balance or closing balance? I mean, this 28 lakh represents what, sir? Closing balance, which is representing 85%. It represents 85%. We want opening balance, which represents how much percentage? 100%. Pro rate. 28 lakh is for 85 means for 100%. Opening balance will be how much? Multiply 28 into 100 divided by 85. If you do, how much you going to get? 32 lakh 94,118. So opening balance of fixed asset was 32 lakh 94,118. You have charged a depreciation of 15%. Calculate 15% depreciation. Either you can find depreciation as these two come minus, or you can multiply 50% of this. You will get 4,94,118. That is the depreciation we have calculated. Done, people. So far, any problem? No. Let's update this value. Fixed assets ka value. I'll update only the closing balance. What is the fixed asset ka closing balance? We got it. Here only we'll write. Fixed asset ka closing balance is 28 lakh. This we have got it. Yes, Saru. Any problem? No. Okay. Next, start. What is the next information they've given? Check what has been established. Sir, they linked something. What is that? Cash and bank balance. Cash and bank balance is 10% of current assets. Did they stop there? No. They said cash and bank balance is 10% of current asset. But this current asset should be after netting off prepaid expenses. Stop. What is the current assets we have got it here? The current assets we have got in our question right now is 84 lakh. Sir, can we take this number and find out cash and bank balance, or we have to net off prepaid expense? We have to net off prepaid expense. Prepaid expense given in the question is 7.5 lakh. First, reduce 7.5 lakh. That's what we mean by netting off. After netting off, after netting off prepaid expense, what is the current asset? 76.5. Any problem? So this is current assets after netting off prepaid expense, which is 76.5. Any doubt? If this is 76.5 means bank balance, they told it is 10% of this particular number, not me. Question has told that. Yes, no. So this is 76.5 means cash and bank balance will be 10% of that, which will be how much? 7,65,000. Okay, G. So in these sort of questions, what you do is have balance sheet ka format. As in when you find the components, go on updating. So it will help you to decode few things. So how much bank balance you got? 7,65,000. Go back to the question balance sheet and fill out this value. So inventory we got, or rather cash balance we got it to be 76,500. Correct now? This we have got it. Any problem? 7,65,000. I don't know. No. Or okay, fine. I'll take a number. Maybe you would have seen better. 7,65,000. Okay, G. Now 1 minute. Carefully observe. What is it? If you observe current asset, one observation you should be able to get it. What is that? Sir, there is a prepaid expense. There is a prepaid expense. Is prepaid expense showing under current asset? Crazy question. Why? Sir, prepaid expense, they are not showing under current assets. They are reducing it from current liability. Dabba people. I don't know who used their kidney for this question. Prepaid expense should come under current assets. But in the balance sheet, they are saying prepaid expense don't show under current asset. Reduce it from current liability. Can we question the question? No. Okay. That means what is the total current assets? What is the total current assets? Total current assets, how much did we get, sir? We got current assets to be 84 lakh. Can I show 84 lakh in my balance sheet? No. Because in my balance sheet, solution ka balance sheet, can I show prepaid expense under current assets or reduce it from current liability? Reduce it. That means what is current assets? Current assets ka value will not be 84 lakh. We have to reduce 7,50,000. Yes, people. That's how they are asking us to prepare balance sheet. Don't ask me. Question ka requirement. Okay. So after netting off prepaid expense, what is the current assets? 76.5. Okay, Saru. I mean 76.5 lakh or 76 lakh 50,000 is the total current asset in this question. Why? Why not 84 lakh? Tell me once again. Why not 84 lakh? Because prepaid expense of 7 lakh 50,000 is shown under current assets or reduced from current liability. It's reduced from current liability. Correct or question ka requirement? Question ka requirement. Can't do it anything. Okay, so we got total current assets in our balance sheet. We got cash and bank balance. Only thing we need to find now is inventory and trade receivable. But one good thing here, I can find the total. What is the total? Sir, fixed assets ka closing balance is 28 lakh. Current assets ka total is 76 lakh 50,000. What is the total? Quickly tell. These two you add. What are you going to get? 104.5 lakhs. Sir, if total asset is 104.5 means total liability also will also be 1 lakh or 104.5 lakh rupees. Everybody good. Oh, that means awesome. Why? Sir, total liability is 104.5. In that current liability is 45 lakh means capital employed will be balance. What is that balance? Tell me. So this will be what? 104.5 minus 45 lakh. How much is this? Quickly tell sir. 59 lakh. 50,000. This also I've got. Understood? Or some other number? Correct number? Over? So far all good? All good? You need a minute to review or so far? Okay. Yes, no? Yeah, this is where you should tell something, Pa. Okay, na? Can I move on? Online also okay, na? Continue, pakka continue, or too much sapad or going off goal like this? No. That is also there, sir. Your explanation is putting more sleep, sir. That's okay, sir. Okay. So I'll start further, sir. Next, I can find out what I will see. So coming back to the question. So I found out almost many components. So now I'll figure it out. Sir, only thing I need is two components on the liability side. That is reserves and surplus and bonds. These two I need to find out. Then probably I need to find out, I think this one is also there. Creditors and outstanding expense. I also need to find out inventory and trade receivables. And here, no, somebody used their kidney too much only. Too much only they used. Why, sir? Okay. Now check. There is a relationship. What is that relationship? Sir, GP is how much? 20% of sales. Sir, if GP is 20% of sales means COGS is 80% of sales. Okay, now. Now, what I say is some mathematically jargon they brought in. What is that is? Let sales. You can't find debtors and inventory because no other information. You can't find debtors also. You can't find inventory also because information is not available. But there is a linkage. What linkage is? Let sales be X. You'll have to assume a variable. Let sales be X. That X method. We don't like our X's, but still we have to use our X's in this problem. Okay. So let the sales be X. Correct? Sir, if sales is X means COGS will be how much? 80% of sales. So it will be 0.8x. How much will be your GP? GP is 20% of sales, which is 0.2x. Done. Everybody cool. Now let's calculate your debtor. We'll calculate stock turnover ratio. How do you get stock turnover ratio? Tell me once again. COGS divided by closing stock. How much is that? 15. So let's substitute. This one you understood. No, we'll have to do a variable over here. I've solved it. I'm just saying it here. Let the sales be. Once again telling, let the sales be X. Using this particular approach, I'll be able to find out closing stock as well as debtors. This is the highlight of this particular question. this one, and that netting off of prepaid expenses. I don't know, that according to me is very weird. That should have been not be there. This is okay. This is acceptable. This is a good mathematical adjustment. Agreed. But netting off prepaid expense and from current liability, that to beats me, and I will not question. I will leave it to your best judgment. But let's forgive the mother body and move forward. Okay, sir. So let the sales be how much? X. Sir, if sales is X means GP will be 20% of X, which will be 0.2X. So COGS will be 80% of X, which will be 0.8X. Till here we have got it. Yes, sir. Correct, sir. No. They told stock turnover ratio is how much? Stock turnover ratio, they give it to be 15. Tell me the formula for stock turnover ratio. COGS divided by, we don't have average information here, so we'll have to use closing stock. COGS divided by closing stock is equal to how much? 15. Now will we write COGS or we will substitute? Substitute. Instead of COGS, we will write 0.5x divided by closing stock is equal to 15. Therefore, closing stock will be equal to how much, sir? 0.x divided by 15. Sir, we didn't solve. No, wait, we need this. This is okay. This is okay. Closing stock is 0.x divided by 15. Let's find out debtors. For debtors, they give you debtors turnover ratio. How much was debtors turnover ratio? 12. How do you calculate debtors turnover ratio? Sales. If they told in the problems, total sales and credit sales are same. So you can take the same number. Sales divided by debtors is equal to 12. Yes. Instead of sales, I will write what? What am I assuming sales to be? X. So that means I'll substitute. 12 is equal to X divided by debtors. Debtor is equal to how much? X by 12 when you solve. Okay, G. Now okay na. Pakka na. Now go back to the balance sheet. Now go back. 1 minute. Tell me, remember this value. How much is closing stock? 0.x divided by 15. How much is debtor? X by 12. So try to remember. So now we will plug in here. Now, or maybe I'll not plug in. Can you tell me one? You can find out. Now you can find out debtors and closing stock. Can you tell me how? Let's see how will you use your kidney now. You can find out. You can find out closing stock as well as you can find out debtors. How? Sir, inventory plus receivable plus cash and bank balance is equal to 76,50,000. Inventory is something 0.x divided by 12. Something we got. Debtors also we got it. That means if you add these three, the total should be equal to how much? 76,50,000. Now you got an equation. Solve that equation and you will get X. X is sales. From sales you will get COGS. You will get GP. You will get closing stock. You will get debtors. 5 components. Damar. This is a very good adjustment. Someone properly has used. Okay, sir, this will not click. But for these sort of question, if they bring in, no, they will not do too much modification. Ditto question, they will bring it to you in the examination. Like that. But if this question had come in the exam directly, many people I'm sure would have not even attempted this question. 1 or 2 they would have attempted and said, leave. Not worth it. Yeah. But luckily they have given in an RTP, so we know how to approach. Now can we do it? Okay. What is the equation again? Tell me the equation, make me happy. Equation, you tell me. Equation, no, inventory plus receivable plus cash and bank balance is equal to 76,50,000. That's what I'm written here. Check. Where is it? Here. Inventory plus debtor plus cash and bank balance is equal to 76,50,000. What is inventory? Instead of inventory, we will write 0.x divided by 15. Instead of debtors, we will write x by 12. Cash balance, we already got it to be 7,65,000. This is equal to 76.5. Now solve the equation. Solving should have to tell it's okay. This is okay. This equation you will be able to solve, no? Yes, no, people. When you solve, you will get x to be 5,3,78,050. What is x? Not your x. Here in this problem, what is x? X is your sales. X is nothing but your sales. So in this problem, sales is 5,3,78,050. Now the moment you know sales, GP, COGS, debtors, closing stock, everything you can find out. How much will be your closing stock? Closing stock is what, sir? Closing stock is 0.x divided by 50. X is 5,3,78,050 means multiply. Solve these equations. You have to take 0.8 into this number divided by 15. Do that. 5,3,78,050 into 0.8 divided by 15. If you do, you will get 26,86,829. That is your value of your closing stock. Similarly, how do you get debtors? Debtor is x by 12. X is how much? 5,3,78,050. So this number you take and divide by 12. How much are you getting? 41,98,050. If you want, you can also write down. How much is GP? How much is GP? GP is 20% of GP will become 20% of sales. So how much is sales? 5 crore 3,78,000. That ka 20%. This number ka 20% you do. How much is GP? 1 crore, quickly tell. 1 crore 75 lakh. 1 crore 175. 1 minute. 100,75,610. This is your GP. Can you also find out COGS for me? Yeah, COGS will be what? 80% of sales. So this is your sales. This is your sales. Sales ka 80% you do. This number ka 80%. If you do, how much you gonna get? 40,30,244,0. 4 crore 3,02,000 or whatever, some number. Correct? That is your COGS. Sir, the moment you know COGS, you can find out creditors. Why? Check the question. They told, what is that? They gave you creditors turnover ratio, but creditors turnover ratio in this problem is based on purchases or it's based on COGS. So that means the formula for creditor turnover ratio in this problem is what? Instead of credit purchases, you will take in the numerator COGS. COGS divided by creditor is equal to 10. You already know COGS. So find out the creditors using this information. That is the next information. You can find out trade payable. Creditors turnover ratio is 10, but it is based on COGS. So COGS divided by creditors is 10. So trade payable will be COGS by 10. COGS by 10 if you do, you'll automatically get 40 lakh. Basically, this is your COGS. This divided by 10 if you do, you should be getting 40 lakh 30,244. Done, people. Now we have majority of the numbers. Let's go ahead and fill our balance sheet. So how much is the stock we got? Closing stock is how much? 26 lakh 86. 2686. How much is that number? 2686,829 or 289. 2686,829. Okay, this is 2686,289. Okay, then trade receivable was how much? Trade receivable was 4198,170. 4198,170. I mean, this is fully completed. I don't have to worry about that. Yes, no. And I got fixed assets opening balance also, depreciation also. This also is completed. That means asset side of balance sheet pending or fully done? Fully done. Okay. That's the only thing I got, or even creditors also I got. Creditors also we got. Creditors ka value is how much? 40 lakh 30, 40, 30, 244, right? Creditors is 40, 30, 244. Awesome. I can figure out outstanding expenses. Balancing figure. Total current liability is 45 lakh. In that, if creditor is 40 lakh 30 to 44 means your outstanding expense will get it as balancing figure. How much? These two ka minus you do. How much is that? 4 lakh? 4 lakh 69,000. 756. That's what. So I mean, this portion is also fully damar. Yes, sir. Only thing we have to find damar now is receivables and bonds. Now see what information we did not use. Did we take stock turnover ratio we used? Yes. Cash is over, GP is over, creditors is over, debtor is over, fixed asset over, depreciation over, current ratio over. Capital gearing ratio. We touched this or we did not even touch? Now let's touch. Capital gearing ratio, how do you get? Preference share capital plus debt divided by net worth. We read the balance sheet. Are you able to see any preference share capital here? Cut. That means capital gearing ratio is how much? What is it here? Debt divided by equity. Equity means equity share capital plus reserves and surplus. That should be equal to how much? 0.6. Equate that. Let's see what we can come out. What we can find out that. Capital gearing ratio is 0.6. In this capital gearing ratio, in this problem, we don't have preference share capital. So directly we'll take in the numerator only debt. Debt divided by equity share capital plus reserves and surplus is 0.6. Debt we don't know. I'll keep it as it is. Equity share capital, I think they gave. Yes, no? Equity share capital was given in the question to be 36 lakh. Reserves and surplus we don't know, but equity share capital we know to be 36 lakh. So take this 36 lakh, reserves and surplus we don't know is equal to 0.6. Now when you solve this, what are you going to get? 36 into 0.6 if you do, you will get 21 lakh 60,000. So bond is equal to 21 lakh 60,000 plus 0.6 times of reserves and surplus. Bond is also unknown, reserve and surplus is also unknown. So can we solve this equation or we have to keep it as it is? Keep it as it is. But I have solved this. I'm happy. Problem over. Why? Problem over. If I get this means problem is over. How? Sir, very simple. Sir, do I know capital employed? Yeah. What is my total capital employed? 59.5. How did I get that? Total liability is 104.5. In that, if current liability is 45, means these three put together should be how much? 59.5. Now you know, is bond ka value expressed in reserves and surplus? Yes. Substitute you'll have to do. Basically, these three if you add, what you should get? These three if you add, you should get how much? 49,50,000. That did you understand now? These three if you add, these three components if you add, it should get 59,50,000. Give me an equation for that. Give me an equation for this. Share capital plus reserves and surplus plus bond will be equal to how much? 59,50,000. This equation everybody got? Okay, let's substitute now. First, let's write that equation. Where is it here? Equity share capital plus reserves and surplus plus bond should be equal to how much? 59,50,000. Done. That only we call it as capital employed. You can write capital employed or directly you can write 59,50,000 if you don't like names. Fine now people? Yes. Sir, equity share capital, you know, they've given in the question how much? 36 lakh. Reserves and surplus, you don't know. Fair enough. Bond also you don't know, but bond now can be expressed in terms of reserves and surplus. Here only you got it. What is that now? Instead of bond, what will I write? Bond is equal to 21,60,000 plus 0.6 times of reserves and surplus. So instead of bond, I will substitute with this number. Do you agree with me? Correct. Just a substitution. Once more or okay? People. Yeah. So reserves and surplus, we have it as it is. Instead of bond, we will write 21,60,000 plus reserves and surplus. If you want, instead of reserves and surplus, you can assume a variable x. If x is your liking means. Okay. Or you keep it as it is. Now solve, sir. Okay. 36 lakh plus, this one you'll have to solve now. You should have to solve or manageable. Manageable or you're not answering. Okay, fine. So do it, sir. 36 lakh plus 21,60,000 is how much? Quickly take your calculator. 36 lakh plus 21,60,000 is how much? What is that? 57,60,000. This 57,60,000 will go to the other side. So minus that. 59.5 minus that number you do. How much you're going to get? 1,90,000. That's how directly I've written 190. Okay, Saru. This is reserves and surplus. When we write reserves and surplus, it is always what? One reserve and surplus. Correct? No, it is one reserve surplus. This is 0.6 reserves and surplus. One reserve surplus, 0.6 reserves and surplus. When you add, it will become how much? 1.6 times of reserves and surplus. Now, how do you get reserves and surplus? 1,96,000 or 1,90,000 divided by 1.6, which is 1,18,750. That's how to find out. Okay, G. Now, if you know reserve and surplus, can you find out bond? Yeah, bond is equal to 21,60,000 plus 0.6 times of reserves and surplus. Substitute that. Now, reserves and surplus is 118,750. 0.6 times of that you do and add 21,60,000. You will get the value of bond. Proper question. Okay. Basically, this is given to waste time. That's all it is. At the end of the day, you could say. So, bond ka value is 22,31,250. Bond also you got. Reserve and surplus also you got. Balance sheet pending done. Balance sheet done now. That's all is this question all about. Okay, G. Yes. Pakka, G. One recap. Let's give a G for this question, G. Okay. First adjustment here is they gave you current liability is 45 lakh. This is normal one or after adjusting? After adjusting. That means the actual current liability 45 lakh or 52 lakh 50,000? 52 lakh 50,000. That is one. And they gave you current ratio in the question. How do you get current ratio? Current assets divided by current liability. Sir, the moment you know current liability, you can find out current assets. Okay. And current assets is how many times, how much of total assets? 75%. If you know current assets, you automatically know total assets. Like that. If you know total assets, you can find out fixed asset because fixed asset is how much? 25% of total assets. That's how those particular components are linked. That's what we used. Is it okay? Short summary I'll give you. That's fine now. Okay. Next, they told cash and bank balance is 10% of current assets. Do I know current assets? Yes. How much is the current assets I got? Using your current ratio, I got current assets to be 84 lakh. Can I take this number and find out cash and bank balance? No. What did they say? Current cash and bank balance is 10% of current assets after netting off prepaid expense. That means from this 84 lakh net of prepaid expense, how much you will get? 76 lakh 50,000. 10% of that is your cash and bank balance is what as per the question is. So cash and bank balance also you got. Okay. So now what is that, sir? What is your current assets now? What is your current assets? Current asset is it 84 lakh? No. Because this 84 lakh includes prepaid expense. Can you show prepaid expense under current assets in this problem or under current liability? I mean, as per this particular problem goes, current asset is not 84 lakh. It is 84 lakh minus 7.5 lakh, which is how much? 76 lakh 50,000. So that means in this question, you got the net current asset to be shown in the balance sheet to be 76 lakh 50,000. Okay. So these three, if you add, you should get 76 lakh 50,000. This one we already found. In fact, cash and bank balance we already found. Inventory and receivables was not given. They had given no information. Hence, we assumed sales to be X. We assumed sales to be X. They told GP in the problem to be 20%. 20% of sales. Sir, if GP is 20% of sales means COGS will be 80% of sales. Now you will get closing stock in X terminology. You will get debtors in X terminology. So inventory plus debtor plus cash bank balance, if you add together, you will get 76 lakh 50,000. You have an equation. Solve that equation. You will get X. What is X? Sales. The moment you know sales, you know GP, you know COGS, you know closing stock, you know debtors. Yes, this is the linkage. Yes, people. And they also linked COGS with the creditors. They also linked COGS with the creditors. If you know COGS means you can also find out creditors. If you know creditors means the other outstanding expense, you can get it as balancing. I mean, still here, from here onwards, whatever balance sheet component is there, fully we have done. If total liability is 104.5 and if current liability is 45 lakh means these three put together should be how much? 59 lakh 50,000. So these three if you add means you should get 59.5. Now there is a linkage between these two. How is the linkage established? These two ka? Capital gearing ratio. Okay, in this, how do you get capital gearing ratio? Preference share capital plus debt divided by equity. In this problem, preference share capital not there. That means the formula is only debt divided by equity share capital plus reserves and surplus is equal to how much? Is equal to 0.6. Now you will be able to express bond in terms of reserves and surplus. If you don't want to take reserves and surplus, you can assume reserves and surplus to be A, B, X, and like that also you can solve. That way you will get an equation. These three put together, you should be 59 lakh 50,000. Solve that equation, you will get reserves and surplus and bond. That's how this question has been thought and put across. Okay, so like this all question will come, sir. Sir, one or two new questions, tricky questions will always come in every paper, not just FN. Okay, you should go and anticipate them. It is all right. Okay, fine. But there will be some straightforward question also. Solve that first. Based on this, for this question comes for 10 marks means even if you get 3 or 4 marks from this question, happy. Now you should get full 10 marks because we have solved. If such question had directly come in examination, even if you get 2 to 3 marks, you should be happy. It is okay because it is not just you. 99.99% of the people would have not solved this if it comes directly in the paper. Because so much of kidney, to solve, to frame the question only, they must have thought so much. Now you will have so much time to think all this. But now if it comes means full marks is good, please. Yeah. Okay, this is done. Can I go for the next one? Now question number 5 is same as question number 35 in our class notes. We'll not be doing that. Only new questions we'll be taking. This is done now. Question number 6 is a capital structure question. I'll keep this question also as an LDR. Last day revision question. Little bit of good kidney usage in this problem also. This RTP is good according to me. Okay. All right. In fact, no sir, I will feel happy if you help me in this question. Because we have done a similar question in regular class. We did a similar question in marathon also. Let's see how much you remember. Operating profit means EBIT. How much? 6,20,000. That is your existing EBIT. Interest on debentures 10% and interest amount is 80,000. The moment you know interest amount, interest rate, what you can find? Debentures ka value. How do you get debenture ka value? Interest amount divided by interest rate. In fact, we should take interest amount divided by expected interest rate. Here expectations and actuals are same. That means the debenture value will be 8 lakh. 80,000 divided by 10%, which will be 8 lakh. Got it? Remember that question which we did? That same question what we did in marathon is being taken and little extended here. That's all. Okay. EBT we got, tax rate is 20%. Keep that in mind. PAT. And then they've given 14% preference dividend is 1,12,000. So that means using this, can you find out preference share capital? Same way. How did you find out debt? Interest amount divided by interest rate. If you want to find preference share capital means instead of interest amount, you will take dividend amount. Divided by, instead of interest rate, you will take dividend rate. So 1,12,000 divided by 14%, you do. How much is that? 8 lakh. So preference share capital is also 8 lakh. Earnings available for equity shareholders is 3 lakh 20,000. This is nothing but we call it as ish. Number of equity shares, each ka face value is 10, but how many number of equity shares we have? 16,000. That means what is equity share capital? Book value of equity share capital is how much? 16,000 into 10, which is how much? 1,60,000. EPS they've given it to be 20. Fair enough. Reserves and surplus is 9 lakh. Awesome, sir. Because adding these only, what will I get? Adding all this only, all these only, we call it as capital employed. Yes, now all this, if you add only, you will get capital employed. But adding all this, you will get market value of capital employed or book value? Book value. You adding all this, you will get book value of capital employed. Okay, Saru? All right. But hang on, let it be that. We will see if we need to add it or not. If you want, you can add also. 16 plus 9 is 25. 25 plus 1 is 26.6 lakh. Yes, correct. 26 lakh 60,000 is a book value of current. I wrote current asset. This is current asset or capital employed? Capital employed. Done, people? Let it be there. Okay, next, let's go forward. Reserves and surplus is 9 lakh. Okay, Namra, this company, Namra, I don't know. They require additional how much funds? 15 lakh for some modernization and expansion. Okay, G. The current capitalization for equity is 20%. Sir, this is your equity capitalization rate, means this is your cost of equity. Okay. Company has a policy to retain 40% of its earnings. This is a highlight of the question. There's a new adjustment. One of the highlight of this adjustment. Because if you observe in all our previous problem, they used to say company has a policy to distribute 100% of earnings. That word used to be given in such problem if you refer. Here 100% is given or 40%? 40%. Keep that in mind. 40% they have a plan to retain. That means how much is your dividend payout ratio? 60%. This is the highlight. Keep this in mind. Okay, there's one newly framed adjustment. The debentures and preference shares are trading at a premium of 10% and 25% compared to their book value. That means book value and market value of debentures and preference shares are same or more? More. Okay, this is your book value. Got it, sir? What we have calculated here is the book value. But market value is same or more? More. Okay, let's read off the question and come to that. The fair value of one equity share is calculated. How do you calculate that? By dividing number of shares to the overall value of the firm. You need to find out the value of the firm. If you want to find market value of equity shares, if you want to find, not me telling, question is saying, if you want to find market value of equity shares, what do you have to do? First, find out overall value of the firm and then divide by the number of equity shares. This is what you have to do to get the price of equity shares. Me or question? Question. Okay. Now check. The equity, what is that, sir? New equity shares for expansion will be issued at 5% discount. Sir, by doing this, by doing this, what will we get? We will get market value of one equity shares, correct? But you want how much funds for your expansion? 15%. You want how much funds for your expansion? 15 lakh. If you want to raise this funds through equity shares, means will you issue this equity shares at market value or 15% discount? 15% discount. First find market value and reduce 15%. You will get what, sir? You will get what? From market price, if you reduce 15%, you will get the issue price of the equity shares. Not me. All question. Don't look at me. I didn't frame. Okay, I'm just solving. Don't kill the messenger. Okay. Now, check. Return on capital employed, ROSO, should be calculated based on the value of the firm. And value of the firm is always expressed on what, sir? Book value or market value? Market value. That's the reason they give you all this pity. More, that means whatever we did here, no. Required or falto? Waste. Because this is book value of capital employed. Can we use book value of capital employed or market value? Market value. Again, we need to find out this. Okay, now. All right. Requirement of the question. ROS is based on the total value of the firm. Now check. The ROS will increase by 10% to its current rate. So let's say if the current ROS, if it is 20% means, if the current ROS is 20% mean, after you do the new project, will the ROS be 20%? No, it will increase by how much? 10%. Don't say I had a 10%. It will increase by 10% to its current rate. That means what you have to do? You have to take 20%, 20 ka. You have to take 20 and multiply it by what? 10%. Basically, it will increase by 2%. So the new rate will be 22%. Is this the actual rows or just assumed for explanation? This is just assumed for explanation. We need to calculate rows. First calculate rows, and to that in your calculator you need to do plus 10%. That way you will get after the new project what is the rows. Okay. Now if the capital gearing ratio goes beyond 2.5, capital gearing ratio, how do you calculate? Preference share capital plus debt divided by equity. If that number goes above 2.5, then the interest rate on additional debt, sir, you need how much additional funds? 15 lakh. You need additional funds of 15 lakh. That 15 lakh you can raise through debt or preference shares or equity. You have three options. Now they are saying if this capital gearing ratio goes beyond 2.5 means interest rate on the new debt or additional debt will increase by 200 basis points. So 100, this is your government terminology. When they say basis point, 100 basis point is 1%. Instead of saying 1%, they will say 100 basis point. 100 basis point is 1% means 200 basis point will be 2%. That means the new debt, what is the existing rate of interest on the debt? 10%. Sir, if the capital gearing ratio becomes, if it crosses 2.5 means, can you raise the debt at 10% or interest rate will increase? It will increase. It will increase by how much? 200 basis point. 200 basis point means 2%. That means the new debt interest rate will be 12%. From 10, this will become 12. Not me. Question. Okay, sir. Only that or no? Or even dividend on preference shares would increase by 0.5%. Currently, preference dividend rate is 14%. It will be 14 or it will increase? It will increase and it will become 14.5%. This is the things. Now, no. Underline the key thing. You are required to advise. What are you required to advise? About the two financial plan. We have two financial plan. We need how much additional funds? 15 lakh. That 15 lakh, no. 2/3 of that 15 lakh. What is 2/3 of 15 lakh, sir? 10 lakh. 2/3 of that amount can be raised through debentures. Okay, that means balance 5 lakh will come through preference shares. First option is you will raise the 15 lakh by issuing debt worth 10 lakh, 5 lakh worth preference shares. Second option, you will raise entire 15 lakh by issuing equity shares. Now they are asking which plan should we go for? Plan 1 or plan 2? Okay. Ideally, the answer in that problem it should be based on market price. It should be based on market price. In our problem, P multiple and all was given. If you remember, debt divided by debt equity ratio, if it exceeds 35%, instead of 10, P multiple will become 8 or something they had given. That was a problem. So there, market price you could have found. Here, have they given market price or not possible? Not possible. That means we will give our answer based on EPS. You will find out EPS for both the option and select that option which gives you the highest EPS. Understood? Too much of data. Simple problem only. Once if you do it, you will get it. When you read the data, it looks like poo. But once you do it, you'll be like, okay. Not that much tools. Manage. First observation. We got book value of capital employed. Do we need book value or we need market value? Market value. Why do we need that? Is simple, sir. Sir, we need rows. We need rows. I'm not talking about your feelings. For solution, we need rows. How do you get rows? EBIT divided by capital employed. And capital employed, we need to take book value or market value? Market value. That means what and all are the components of capital employed? Equity share capital, reserves and surplus, debt and preference shares. All these components we should take book value or market value? Market value. First working note is that. Find out the market value of all the instrument, then you will get market value of capital employed. EBIT is given to you in the question already. Then we will see that and we will do it next. Can we take it up, people? Okay, now I have solved it. Just review this. First, sir, how do you get debt? Quickly, don't drift away. Easy only. Easy. Just pay 5 minutes attention. Problem is solved. Very, very easy only. Everything is easy. Okay, it is just that, sir, first time when you wrote that alphabet A, did you write it properly? No, you used to write. Now, aram you will write, no. So, that only in life. First time when you try something, everything is difficult. 3-4 times if you do means this problem in your sleep also you will answer. With working note, this after this after this after this. It will come. Just a matter of little practice. So, first, how do you get debt amount? Interest amount divided by interest rate. Should I have to explain that once again or is it okay? Interest amount is given in the question to be 80,000. Interest rate is given to be 10%. That means debt is how much? 8 lakh. But this is what value? Book value. We want book value or market value? They told in the question Debt is 10% more than book value. I mean, this book value is 8 lakh means market value will be 10% more, which will be 8 lakh 80,000. First one, Damara. Similarly, preference share capital given or we have to find? Find. How to find? Same. Instead of interest amount divided by interest rate, you will take preference dividend amount divided by preference dividend ka rate. What is preference dividend given in the question? 1,12,000. Preference dividend rate was given in the question to be 14%. So do that, you will get book value of preference share capital to be 8 lakh. We need book value or market value. Market value is same or 25% more. As per the question they told, debt ka market value is 10% more, preference share capital ka value is 25% more. 8 lakh ka 25% you do. How much is that? 10 lakh. Till here we have done. Yes, people. Now reserves and surplus, will it have any market value? No. I mean same. Book value, market value will be same. 9 lakh. Yes, Saji. One highlight of the question. Next, we need market value of equity denoted by the symbol S. Yeah, this is where you should smile or one thing should click. What is that? First, how much is book value of equity share capital? We have 16,000 shares of 10 each. That means book value of equity share capital is 1,60,000. We want book value or market value? Sir, market value of equity only is denoted by the symbol. Yes, so correct. Yes, sir. Here, no, sir, there is a small change. I can't cut this, leave this. I'll tell you this problem. Normally, what do you do, sir? Normally, how you used to calculate? How do you calculate? Yes, so you know this, people. Value of the firm is given by EBIT divided by KO. That is V. S is what? Instead of EBIT, you will substitute with Each. Yes. Okay. Each divided by cost of equity we will take. Yes, sir. But here there's a small funda. In all our problems we have done so far, the assumption was company has a policy of distributing 100% dividend. Actually, it is not each. The numerator is not each. It is actually dividend. Because I thought that problem was easy to connect. Hence, I told, because no, sir, is EBIT available for equity shareholders or each? Each. So it was easy for me to connect with you on that. Hence, I said each and all. But in all our problems, the policy was 100% of each was distributed as a dividend. Sir, if you do each ka 100%, what are you going to get? Each only. Rather, that is only dividend. Actually, formula is not each. It is actually dividend divided by cost of equity. In all our previous problems, since the each was 100%, we used to ignore that and directly take each. But in this problem, can we ignore that? No. Because what, sir? In this problem, company has a policy. What policy they told? Where is it? Company has a policy of retaining how much? 40%. That means how much are they distributing? 60%. That means we want each, or if you want, you can refine that formula. Instead of each, take it as each multiplied by dividend percentage. Each multiplied by dividend percentage. If you still want to stick with each. Okay, here, how much is the dividend percentage? 40%. If you are retaining means how much are you distributing? 60%. So simply take it as each multiplied by the rate. Each multiplied by the dividend rate. How much you will get, sir? Rate of dividend. Okay, or a dividend. Or I'll write it as DPR. Would you be okay with that? What is DPR? Dividend payout ratio. Okay, so how much is each in this problem? Let's not do it this way. How much is this? How much is each? Each we have to calculate, or they gave in the question? They gave in the question. How much is each, pa? 1 minute, I'll show it to you in case you're funded. Earnings available to equity shareholder is 3 lakh ka? 20,000. So take that 3 lakh 20,000. 40% if you are retaining means 60% you are paying. In all our previous problem, it was 100%. So whether you calculated this or whether you didn't calculate, you would have any which way got the same answer. But in this problem, is the company planning to pay 100% or only 60%? So hence, maybe you keep this as a formula. Each multiplied by the dividend payout ratio. This is okay with you? Or simply you can keep the numerator as dividend. That way also you can substitute. Divided by cost of equity. How much is cost of equity given in the question? Cost of equity is given in the question to be 20%. So divide that, sir. How much are you going to get? Quickly do it. How much are you going to get? You should be getting 9,60,000. Confirm for me, are you getting it? So that is what? Market value of equity. Stop there. Once again, tell me what is it? Normally, we used to do what? To find out market value of equity, we used to do each divided by cost of equity. But in all our previous problem, the policy was 100% of earnings was distributed as dividend. That's the reason we never used to do that adjustment. But here it is 100% or only 60%? 60%. Hence, what is the formula? each into dividend rate. Okay, or you can simply keep it as dividend divided by cost of equity. One of the two formulas you can keep it. That divided by cost of equity, if you do, you'll get market value of equity to be how much? 9,60,000. Online also got this new adjustment. This is the highlight of one of the highlight of this question. Quickly confirm, people. Waiting. Online. This video also will be available on YouTube. Later on, aram se you can copy also. So no need to worry about that. Don't waste your time in writing things and all. Just listen for the time being. Yes, online. Waiting. Okay, response is okay. Now, how do you get market value of capital employed? What and all is capital employed first of all? Debt, or maybe we'll go equity share capital plus reserves and surplus plus preference share capital plus debt. But we want this on book value terms or market value terms? Market. So take your calculator. What is market value of equity? 9,60,000. Market value of retained earnings is same. 9 lakh you add. Okay. Then market value of preference share capital 10 lakh. Add. Market value of debt 8,80,000. Add. How much is that? 37,40,000 is a market value of the firm. Okay, Saru. Now we can find out rows. We can find out existing rows. How do you get rows? EBIT divided by capital employed. That capital employed you have to find out as per the requirement of the question based on the value of the firm. Value of the firm is always expressed on market value of the terms. So refine rows ka formula now. EBIT divided by market value of capital employed. That market value of capital employed is how much? 37,40,000. EBIT is given in the question. Check the question. How much is EBIT? Where it went? EBIT is 6,20,000. So 6,20,000 in the numerator. Market value, which is 37,40,000 in the denominator, into 100 if you do. Existing rows is how much? 16.58%. That is your existing return on capital employed for the current project. Current project. Are you planning to do current project or start a new one also? New one. The moment you start a new project, will the rows be same or they told it will increase? It will increase. It will increase by how much? 10% to its current rate. If the current rate is 20% means the rows will increase by 10% or 10% of 20? 10% of 20, which is how much? 2. But is the rows we got 20 or we got a different number? What did we get? What is our rows? 16.58%. This is our existing rows. After expansion, will rows be 16.58% or it will increase by 10%? How to calculate? Simply take 16.58 plus 10% you do in your calculator. How much is that? 18.24%. So after expansion, your rows will be 18.24. This is the till here okay now? Till here okay? Pakka. So how do you get rows? Tell me the formula. EBIT divided by capital employed. EBIT divided by capital employed. Okay, 1 minute. Hang on. Maybe I'll write one more point. Sir, what is the capital employed after expansion? What is the capital employed after expansion? Before expansion, how much was capital employed? Before expansion, how much was it? 37 lakh 40,000. It was 37 lakh 40,000. After expansion, for expansion, are you raising extra money? For expansion, you are not raising extra money, Ada. You are raising 15 lakh, Noda. How much is this, da? 52 lakh 40,000, da. That means after expansion, your capital employed will become 52 lakh 40,000. Sir, how do you get rows? EBIT divided by capital employed. After expansion, your rows is how much? 18.24%. After expansion, how much is EBIT? Don't know. After expansion, how much is capital employed? 52 lakh 40,000. Now means substituting, won't you get the EBIT of the project after expansion? Yes. Understood? Once more. Got it? Tell me, sir, how do you get new EBIT? After expansion, the new EBIT will be these two ka multiplication. 50, that's what I've written here. These two ka add, if you do multiply 18.24%. Calculate that. 52 lakh 40,000 ka 18.24%. If you do, how much you going to get? 9 lakh 55,776. That's what I've got here. This we wanted. Done now. Almost 60 to 70% of the solutions solved. Fine. Sir, we have to decide. We have one plan to raise this 15 lakh or two plans? Two plans. First plan, 2/3 through debt, 1/3 through preference shares. Second plan, entire 15 lakh through equity shares. Okay. Now they gave one drama. What is that? In that problem, the drama was debt equity ratio. Debt divided by debt plus equity. If it crosses 35%, debt will increase, blah, blah, they told. Here it is debt equity or capital gearing ratio. Capital gearing ratio. So ratio, to calculate ratio, you use financial statements. Ratio analysis is done with the help of financial statements. Financial statements means balance sheet, P&L and all. In your balance sheet, P&L and all, will you show market value or book value? Always remember, ratio ka calculation is always on the book value. Now they have asked capital gearing ratio. I should calculate that using market value or book value? Book value. Understood? How do you calculate capital gearing ratio? Tell me once again. Capital gearing ratio. Capital gearing ratio means using fixed cost instrument to increase equity ka return. So that means numerator will be fixed cost instrument. What are the fixed cost instrument? Preference share capital and long-term debt. Numerator is equity, you can call it, or equity share capital plus reserves and surplus, or you can call it as net worth, whatever name. Yes, people. Now for this, I should take market value or book value. I should take book value. Okay. Do you know book value of debt? Do you know book value of debt? Yes. How much? 8 lakh. We already calculated here only. Existing debt ka book value is 8 lakh. Existing book value of preference share capital is 8 lakh. Okay. In first option, how much money you need? In fact, for expansion, how much money you need? 15 lakh. In first option, 2/3 you will raise through debt. 1/3 you will raise through preference shares. Both are fixed cost instrument. Both are fixed cost instrument. That means totally what, sir? New debt and preference shares will increase. After expansion, debt and preference shares will totally increase by how much? 15 lakh. Or you can do one more thing. New debt will be how much? 10 lakh. New preference shares will be how much? 5 lakh. How 10 lakh? 15 lakh ka 2/3. How 5 lakh? 15 lakh ka 1/3. Like that also you can calculate. But anyway, both debt and preference shares are fixed cost instrument. Instead of breaking up directly, I'll write 15 lakh. Done, sir. This is your fixed cost instrument. Okay, now. Divided by what? Equity. Equity ka market value or book value? Book value. Sir, what is equity share capital ka book value? 160. Retained earnings ka book value? 9 lakh. Add the two. How much you gonna get? Add the two. No? Yeah, this is how much? 10 lakh, 60,000. So find the capital gearing ratio. When you find capital gearing ratio, how much are you getting? When you substitute and calculate, you'll get 2.9. Go in there. Why? They told in the problem, if this capital gearing ratio, if it exceeds 2.5, will the debenture carry 10% interest rate? Will the debentures carry 10% interest rate, or it will increase by 200 basis points? It will increase by 200 basis points. That means now the interest rate on new debt will not be 10. It will become 10 plus 2%, which will be 12%. Only this or even preference shares? Preference dividend rate as per the question will increase by 0.5%, not me. Currently, preference dividend is 14%. It will increase by 0.5%, means it will become 14.5. Okay, this is what it is. Done, no? Okay. Second option is to raise the money through equity shares. Sir, if you want to raise the money through equity shares, will you raise it at face value or market value? When you are issuing new equity shares, will you issue it at face value or its market value? Market value. Do you know market value or not yet found? Put one working out to find that. And how to find out market value of equity shares? Should you have to figure out, or they told in the question? They told in the question. In fact, we wrote it also. What is that we wrote? In fact, check here. The fair value of equity shares is dividing the number of equity shares to the value of the firm. You have to take the value of the firm and divide by the number of equity shares. If you do that, you will get market value of 1 equity shares. Me or question? Question is saying. And can you issue this new equity shares at this market value or 15% discount? 15% discount. First, let's find market value. Tell me once again, how do you find out market value of 1 equity shares? Total market value of the firm divided by number of equity shares. So, should we have to find out market value of the firm or already found? Already found. How much is that? Existing market value of the firm is 37 lakh 40,000 divided by number of equity shares. How many equity shares are existing? As per the question, 16,000. This is the existing market value of the firm, and the number of shares we have is 16,000. So how much is the market value of 1 equity shares? 233.75. Currently, the market value of 1 share is 233.75. Can we raise the equity shares at this price or 15% discount? 15% discount. 15% discount means 15% lesser price. So take this number and reduce 15% in your calculator. How much is that? 198.69 is the issue price of new equity shares. Okay, G. In second option, in first option, are you raising any equity shares? No. In first option, your 2/3 of the money will come through debt. 1/3 will come through preference shares. In second option, entire 15 lakh will come through equity shares. Stop. How much money you need through equity shares in second option? 15 lakh. And one issue value of issue, the value of one equity shares for issue purpose is how much? 198. That means how many shares you need to issue? You want to raise 15 lakh and the value of one equity shares is 198.69 means how many equity shares you'll have to issue? 7550 because you're calculating EPS. For calculating EPS, you need the total number of equity shares. So this is the extra shares you need to raise. Under which option? Plan 2 or plan 1 or plan 2? Plan 2. Give you a minute. Observe this. Good RTP. Definitely good RTP. Too many things they have brought in. But it is okay. But 1 or 2 times if you practice, you'll get it. Huh?
So why don't we use the market value of equity, which is 9,60,000?
Requirement of the question. But they told fair value of one equity shares, you find like this. If they had not told, maybe I could have done like that. He's saying, sorry, anyway, you know the market value of equity is how much? 9,60,000. That you divide by number of equity shares, you'll get market value of 1 share. Yes, correct only. But question doesn't like him. Question told you find out fair value using this approach. So we can't question the question. So we'll have to go ahead with this. That's a drama. Okay, people. Now question over our last step. Last step. What is that, sir? We have 2 options. Which one will you select? You have to calculate EPS. And this is simple. You know this. How do you calculate EPS? You start with what? You need each. You have to start with sales or you already have EBIT. New project ka EBIT you already have 9,55,766. Start with this number. Tell me the order quickly tell. From EBIT you'll reduce interest. So stop, visualize. You'll take existing EBIT or after the new project. After the new project you'll take new EBIT. From that you'll reduce interest. Stop. You already have existing debentures. Only existing debenture is there, also new debentures. On new debentures you will get extra interest. So deduct that. That means again rephrase. From EBIT you have to reduce old debenture ka interest and reduce new debenture ka interest. What will you get? Earnings before tax. From that reduce tax. What will you get? Earnings after tax. From that reduce preference dividend on old preference shares. Again preference dividend on new preference shares. You will get each. Each divided by number of equity shares. Number of equity shares is existing equity shares is 16,000. And if you go for equity option, you have to issue extra shares of 7,550. Then way you will get the EPS. That's all is a tracker. That's what we have to put it up here. That I have taken the ICA solution. Can we review that? Quickly we'll review. What is the new EBIT? 955,766. That we will start. From this, we have to reduce interest. First, interest on your old debt. On old debt, how much is the interest, sir? On old debt, interest is 80,000. Okay. On old debt, you have to reduce the debentures to the extent of whether you go for first plan or second plan. Old debt, will it change or this will be same only? This will be same only. Okay. Okay. For, again, if you want, you can recollect. In option number 1, what are you doing? Out of 15 lakh, 2/3 will come through debt. That means what is the debt value? 10 lakh. And 1/3 will come through preference shares. 15 lakh ka 1/3 is 5 lakh. This is option number 1. In option number 2, entire 15 lakh will come through equity, just for your reference. Now, how much debt are you raising in first option? 10 lakh. Can you raise the debt at what? 10%? Because old debentures ka interest rate was 10%. Since capital gearing ratio was more than 2.5, the new debentures will have an interest rate of 12%. So how much new debentures are you issuing? You're issuing new debentures worth 10 lakh. On this new debentures, you have to pay interest at the rate of 12%. 10 lakh or 12% is how much? 1,12,000. In second option, new debt is coming in or only equity is coming in? That means, will there be any new interest or no new interest? So from EBIT, you have reduced interest. What did you get? EBT. Reduce the tax. You will get EAT. Now you have to reduce preference dividend 1 time or 2 times on old as well as new. What is the preference dividend on the existing shares? And the existing shares preference dividend given in the question is 1,12,000. Whether you go for first option or second option, existing preference dividend will anyway continue. Correct? No. Now you will also get dividend on new preference shares. Correct? Which option has preference shares? Both option or first option? In first option, how much preference shares you will issue? 5 lakh. And this preference shares, can you issue it at 14% existing dividend rate, or it will increase? Since capital gearing ratio was more, now you have to give a dividend at the rate of 14.5. So how much preference shares you are raising? 5 lakh. Dividend rate is how much? 14.5. 5 lakh ka 14.5 you do. 5 lakh into 14.5 will give you dividend on new preference shares to be 72.5. In second option, preference shares will come or no preference shares? No preference shares. So you will get each. You will get each divided by number of equity shares. How much equity shares is already existing? 16,000. Will that change or same? Same. Under first option, are you issuing any extra shares or no extra shares? That means extra shares here is 0. So now you can calculate EPS under first option. Each is 420. Total number of equity shares is 16,000. Divide these to how much is it? 26 point EPS. 26.26 is the EPS under first option. Under second option, you already have 16,000 shares. But second option is what option? Equity. So when you are issuing new equity shares, number of equity shares will be same or it will increase? How much new equity shares you will issue? We have already worked out that. How much is that? 7,550. You have to issue under second option 7,550 extra shares. That means the total number of equity shares is how much, sir? Add these two. 23,550. This is your each. This is your number of equity shares. Divide. How much you are getting? 25. Now tell me the conclusion. Which one will you go for? MPS you can't calculate. So you have to decide based on EPS. Lowest EPS or highest? Which is highest? This we are happy. Option 1 you select. Next, no. Good question. Okay. But practice. This one I think Aram se can be managed. It is okay. The only takeaway is market value of equity. That is one. Till now we used to find out market value of equity SS. Each divided by equity. Is it each now? It's actually dividend divided by equity. Or if you want, you can use another formula, each into DPR. DPR is in dividend payout ratio. That is one takeaway. Remaining, I think, is okay. Manageable. Yes, no. Because remaining everything was given in the question only. Rows you have to find out using market value. All that we have to remember or data given in the question. The moment you read the question, all that will come back to you. And also keep this in mind. Ratio calculation, always you'll have to do it on the book value. Okay, because you do the ratio based on your financial statements. Unless the question says you calculate based on market value, primarily we calculate the ratios using book value itself. So capital gearing ratio, you take book value and do the things. That is one you need to remember. Rest all, when you read the data one by one, things will keep coming in. Now done part. Now I think you're regretting the decision of doing RTP first, no? Instead of using MTP one first. Okay, this question according to me is done, sir. Can I go for the next one? Sir, every question is like this, sir. No, sir. Next, all simple ones. Yes, online. Can I move on? Can I move on? Two people told I don't want to attend your class. They're going only. It's okay. I was just kidding. Go on. Carry on. Yeah. This is done. Next, question number 7 is on leverage study. A good question. I'll keep this also as an LDR. That means another brain spinning, sir. No. 1 or 2 adjustment is new. That's all. Manageable, but still. This is okay, sir. There's not too much kidney they have not used. In fact, if you use little bit of your kidney, you'll get it. Okay, review. Sales they have given. Okay, first is not always check. What have they asked? Operating, financial, combined, leverage. For OL, FL and CL, anyway we need income statement. Okay. Yes. For OL, what is the formula, sir? Or tell me. If you want, you can remember it as old C. C for contribution, E for EBIT. Operating leverage is given by the formula contribution divided by EBIT. Then financial leverage will be EBIT divided by EBT. Okay. Financial leverage, if there is no preference shares, is given by the formula EBIT divided by EBT. Okay. If there is preference dividend, EBIT divided by EBT minus preference dividend into 1 minus tax rate. In one of the questions they have asked that. I don't think so this is that question, but anyways, always recall that better. Combined leverage is given by OL into FL. That is okay with you? Okay, that's it. So that means all this anyway requires EBT, EBIT and all. So let's better put up the income statement. So let's read off quickly the data. OL, FL and CL, and they also asked PV ratio. How do you get profit volume ratio? Contribution divided by sales into 100. I mean, pakka I need income statement. Because to calculate PV ratio, I need a sales. Sales is a topmost number. EPS is the bottommost number. Put it. Rows they are asking. And they're also asking EPS. New thing or known? We know how to calculate. Yes. Does Kshitij Limited have favorable financial leverage? I think I told this, but anyway, we'll see that. Percentage change in EPS if EBIT increases or decreases by 15%. So they are trying to measure the relationship between EBIT and EPS. Sir, which leverage measures the relationship between EBIT and EPS? Financial. Operating leverage measures the relationship between sales and EBIT. Financial leverage measures the relationship between EBIT and EPS. Combined leverage measures the relationship between topmost number sales, bottommost number EPS. Here they're talking about EBIT and EPS. So we have to use what formula? Financial leverage. Now they are asking one more last minute. At what level of sales, PAT, there's one more requirement. It is there in the next page. I brought it here only. Sir, I told this question. Sir, some problems may they will use EPS. Some problem may they will use PAT. It is one and the same. It is one and the same. So here check. At what level of sales, PAT will be equal to 3/4 of current level. So we'll have to use for this particular combined leverage. I'll tell you how. This one you leave it to me. Rest other things are okay. Basically, we need to find income statement. For finding income statement, they've given some data. Let's see what data they've given. Sales they've given. Awesome. Sir, in these sort of question, first have the format of income statement. Sir, this is a leverage question. For leverage, what is income statement ka format? Sales minus variable cost gives you contribution. Contribution less fixed operating cost gives you EBIT. From EBIT, reduce interest and all the drama will follow. Okay, now first have that format. Particulars, amount, and if the simple one means we'll do the workings here only. This format first you make and first update what and all data they've given to you in the question. First update in this income statement. What they have given, let's find. What have they given? Sales. Let's try to mentally remember first. Sales is how much? 180. Fixed cost excluding interest only, we call it as FOC. FOC as in fixed operating cost. That is given how much? 45 lakh. Anything else? And they've given debt will not come, tax. So tax rate is given. We will see that later. Only these two are relevant now. So sales is how much? 180 lakh given now. And then they have given fixed operating cost given 45 lakh. These two they have given. Fine, sir. So now let's see. I think this is only relevant. Then we will see missing figure how to find out. And now they are given break-even point sales. Good enough. I think this is good for me to start. Sir, how do you get break-even point? Tell me. Break-even point not in units. If you want break-even point in units, the formula is fixed cost divided by contribution per unit. We want fixed break-even point in units or sales. Sir, how do you get break-even point in sales, sir? Fixed cost divided by PV ratio. Yes, sir. And check here. What do you know? Do you know FOC? Yes. Do you know break-even point? Yes. That means using this, what you can find out? PV ratio. That's a good enough substitute. Can we substitute this? So break-even point sale is how much? 120 lakhs. So let's start with that. Break-even point sales is given by the formula fixed cost divided by PV ratio. Break-even points they've given in the question to be 120 lakhs. Fixed cost they've given in the problem to be 45 lakh. Substituting, you get PV ratio how much? 0.375 or 37.5%. Yes, everybody. This is one of the requirement of the question which we have done, which we have covered. Okay. Yes, sir. All right. This is cool. Next, we will see. And in fact, I think I can proceed here only. How do you get PV ratio? How do you get PV ratio? Contribution divided by sales into 100. And congratulations, sales is anywhere. Sales is anywhere given. So substitute. PV ratio is given by the formula contribution divided by sales into 100. PV ratio just now we got it to be 37.5. Contribution we don't know. Sales is given 180 lakh. Substitute, you will get contribution how much? 67.5. One quick way here is the moment you get the data, push it to the income statement. That will help you to solve the things faster. Contribution now you got how much? 67.5. Update that. Contribution is 60, sir. Awesome. Sales you know. Contribution just now you got. That means variable cost is missing or you know. You can find out. How do you find out variable cost? 180 lakh minus 67.5, that is 112.5. This is done. Sir, contribution we found. FOC is given. FOC is given. From contribution, if you reduce fixed operating cost, what you will get? EBIT. This is automatic. There's automatic yes, no. So till here we have worked out. So far fine now. Now let's proceed further. What extra information they have given? Sir, this is the little bit you need to worry. They have given not interest rate. They have given cost of debt. They have given KD. They have given KD. Sir, KD considered interest rate or after tax? Sir, it is always, cost of capital is always expressed on before tax or after tax? After tax. You know, there was a shortcut formula to find out cost of tax, cost of debt. What was that? If no adjustment is given, I had given you one shortcut formula. How do you get cost of debt? Interest amount, interest rate into 1 minus tax rate. Yes, sir. Now, cost of debt is given to you in the question to be 9%. Interest, we don't need cost of debt. We want interest, because on the interest rate, we calculate interest amount. Yes or no? Yes, this I here is for interest rate. That is not given. Tax rate is given. How much is that? 25%. 25% is 0.25. So calculate, sir. 9% is equal to interest into 0.75. So interest will be how much? 9 divided by 0.75. If you do, how much is it? 12%. So the interest rate actually is 12%. Sir, you know the debt. You know the debt. If you know the debt and if you know the interest rate, can't you find out interest? This is good adjustment. Understood, everybody? Easy only, but good one. Yes. Once more or clear? Clear. That is what I've done over here. Check. First, I found out the interest rate using this cost of debt ka shortcut formula, and I got interest rate to be how much? 12. Now, can you find out interest amount? Yes. Debt is given in the question to be 90 lakh. Interest rate, we have got it just now to be 12%. How much is the interest amount? 10 lakh 80,000. Now, go ahead and put it in the income statement. Interest is how much did we get it? 10 lakh 80,000. Sir, EBIT, we got it. EBIT, we already got it. Interest just now we got. How much is that? 10 lakh 80,000. From EBIT, if you reduce interest, you will get earnings before tax. Tax rate is anyway given in the question to be 25%. So reduce that, you will get earnings after tax. We read the question, there is no preference dividend. That means each will be 8.775 lakh. Till here, we have got all the numbers. We have read the data and we have got the numbers. Yes, sir. Okay, come back to the question, sir. What else they have given? I've used this info. Equity share capital. Again, use this information. How much is equity share capital? 150 lakh. Each equity shares ka face value is how much? 100. So how many shares you have? 150 lakh divided by 100. If you do, you'll get 1.5 lakh. 1.5 lakh. For EPS calculation, we need number of shares. How much is the number of shares? 1.5 lakh. That we just now got, putting it in here. That's what I've done here. 150 lakh divided by 100 will give you a number of shares to be 1.5. Each you know, number of shares you know. EPS is difficult or got it? Got it. Income statement fully solved. Okay, we will. Now using this income statement, first requirement, OL, FL and CL. OL, FL, CL, you need my help, sir. Contribution divided by EBIT. There is no preference shares any which way. That means financial leverage, fancy formula or normal formula? Normal formula. Combined leverage also normal formula. PV ratio also was one of the first requirement. PV ratio we have to find or already found. So first requirement fully we have completed. Need a minute or carry on? Okay, let's go for second requirement. Second requirement, they've asked rows. How do you calculate rows? EBIT divided by capital employed. Sir, EBIT, we have it here. How much is EBIT? 22 lakh 50,000 divided by capital employed. Here we have only two components. Equity share capital, reserves and surplus not given. How do you get capital employed first of all? Equity share capital, add reserves and surplus, add debt, add preference share capital. Reserves and surplus information, preference share capital information not given. Only equity share capital and debt they have given. How much is equity share capital given? 150 lakh. Debt they have given to be 90 lakh. Both are given in the data only. Okay now. So if you add these two, you will get 240 lakhs. Calculate rows. How much? 9.375. In the same requirement, they also asked EPS. EPS we have to find or already found? Already found. How much is that? 5.85. Copy that again. Second requirement is also done. Okay, G. Third one, they asked, once again, I'll read that third requirement for you. They're asking you, does this Kshitij Limited company have favorable financial leverage? Sir, financial leverage measures financial risk. It measures financial risk. Now, 1 second. Sir, how much is the rows you just now got? Tell me again. Rows, just now we got it to be, you calculated rows and you got to be 9 point, or here only, right? Rows is equal to 9.375%. Okay. Financial leverage measures financial risk. Sir, did you take a debt? Yes. On your debt, how much interest are you paying? 12%. Happy or sad face? Happy or sad face? Sad face. Why? Sir, you are borrowing a debt and giving on that debt. How much cost? 12% cost you are incurring. But using the debt, you have done a project. You have done a project. That project is giving you a rose as a return of only 9 points. That means taking the debt was a good decision here or bad? Sir, if it's a good decision, we say it's a favorable financial leverage. Bad decision means unfavorable. Tell me here, favorable or unfavorable? Your interest rate is 12%. Your cost is 12%, but your benefit is only 9%. I mean, this is an unfavorable financial leverage. The company does not have favorable financial leverage. That's what we need to write. Suppose if it was ulta scenario means, if the rose was 15%, cost of debt is only 10% means good decision. Because your cost is 10, your return is, benefit is 15. In that case, it will be favorable financial leverage. But in this problem, it is favorable or unfavorable. Or rather, it is not a favorable financial leverage. Good theory question. I think I did discuss this when I did marathon. Anyways, no problem. Now the numbers we have to kind of connect with that. Carry on. Next requirement, I'll read that requirement once again for you. Change in, they are asking you to find out percentage change in EPS if EBIT increases or decreases by 15%. Which leverage measures the relationship between EBIT and EPS? Financial leverage. How do you get financial leverage in percentage formula? Tell me. That we call it as a degree of financial leverage. How do you get that? Percentage change in EPS divided by percentage change in EBIT. They said EBIT has changed by how much? 15%. So you already know financial leverage. This is a formula. Okay. You already know financial leverage. How much is that? 1.921. Percentage change in EPS we have to find. Percentage change in EBIT they have given it to be 15%. Calculate. If 15% there is a change in EBIT means EPS will change by how much? 28.84%. Sir, how it will change? Or rather, in which direction it will change? Sir, if EBIT increases by 15% means EPS also will increase by 28.2%. If EBIT reduces by 15% means rather EPS also will reduce by 28. That's what we need to write over here. Okay. Because they have given both increase as well as decrease. Understood? You need to call out that. In fact, I think here they told both increase or decrease or only decrease. Don't increase or decrease. So that means we need to answer on both the terms. Okay. Will it move in opposite direction or leverage is same direction? Same direction. But it will move at a same pace or higher pace? Higher pace. That's all. Last requirement can we do? What is the last requirement? Check. One by one you read, you will get it. Okay. At what level of sales? That means you need to find at what level of sales means sales is given or we need to find? We need to find sale value. That's the first thing. At what level of sales? PAT will be equal to 3/4 of its current value. PAT should become 3/4. PAT should become 3/4 of its current value. What is current PAT, sir? Check. Current earnings after tax or profit after tax is 8,77,500. Write that. Current PAT is 8.775 lakhs. Okay. It should become this number or it should become 3/4 of this number. So calculate 3/4 of this number. I am telling or question told? Question told. Okay. It should become 3/4. 3/4 means how much? 6,58,01250. Okay now. Fine. That means here PAT is increasing or reducing us, sir. From 8.5 it is becoming 6 point something means it is actually reducing. Find out the reduction percentage. Find out the reduction percentage. How do you find out the change percentage? Change in amount divided by original amount into 100. Calculate. From 8 it has become 6 means how much is the reduction? These two come minus you do. How much is that? These two come minus is how much, people? 2 point something. Okay. Divided by original amount. How much was the original amount? 8.775. That you will get it in percentage. How much is the percentage reduction? 25%. If you want, you can prove it also. So take 8.775 lakh minus 25% you do in your calculator. What are you getting? Obviously, you will get 6.58125. That is what they are trying to say. Okay, Saru? Yes. That means indirectly they are saying what, sir? PAT has reduced by 25%. Now they have given PAT. They have given you PAT. They have given you PAT ka reduced percentage. They are asking you how much is sales. Now tell me which leverage measures the relationship between sales and PAT. Sir, you can call it as PAT or you can call it as EPS. One and the same. I told you, right? They all go hand in hand. In fact, one question also we did and I told it you clearly on this. So that means what, sir? Which leverage measures the relationship between sales and PAT or sales and EPS? Combined leverage. What is combined leverage ka formula? Percentage change in EPS. Here we will write EPS or we will use question ka data. Instead of EPS, what have they told? PAT. That means combined leverage ka formula will be percentage change in PAT or EPS divided by percentage change in sales. Combined leverage missing or no? How much is that? 5.7693. PAT ka change, just now we found out. PAT has reduced by how much? 25%. So that means sales will reduce by how much? Solve. Sales will reduce by 4.33 percentage. Yes. They've asked you sales ka reduction percentage or sales value? Sales value. So because of this, if PAT reduces by 25% means sales will reduce by 4.33 percentage. Currently, what is our sales, sir? We already know. Currently, what is our sales? 180 as per our income statement. Current sales is 180 lakh. From 180 lakh, it will reduce by 4.33 percentage. So it will become how much? 1 point. I think they asked what in this problem, new sale value or percentage only?
Sale value.
At what level of sale? That means you need to find out sale value. Okay, so what is the sale value, sir? 172.2. That's all. Easy only. Yes, no? Manageable, I think. This is not that much of head spinning question, I believe. Okay, no? Wait, carry on. Sorry, enough, sir. Hey, wait. 2 more questions are there. 2 more questions. Easy. Sir, you tell everything easy. Because it is easy only. Need a minute to review or okay? This no need for any recap. No, this is a simple one you can manage. Okay, next one. Next one is a dividend decision. I was so happy seeing this question. I thought repeat and I thought I will just go on. Unfortunately, ICA gave second requirement. This first requirement is ditto our class question. Ditto class question. It was a previous RTP question. Till here it is the same. I thought, hey, aram se one question I can cut off. But ICA doesn't like me cutting off. They gave one more requirement. Because of second requirement, unfortunately, now I have to do. For me, sad. Okay, let's see what this question. Simple question only. But second requirement has one concept. So we need to be aware of that. Mr. A has gathered following information for his analysis. That's his problem. A company pays regular dividend on a quarterly basis. Sir, this is a dividend decision. That too, if you read the requirement, you need to calculate the price of the share using Gordon and Walter. Gordon ka formula in your sleep also you will tell. Walter ka formula to literally you will write it in your left hand only. Yes, no, that many times you have done. You should remember all this. Yes or no? We need to find the price of the share using these 2 models. Let's see. Or I am telling, let me not be overconfident. Tell me Walter ka formula. Walter ka formula ఒకసారి చెప్పండి పా சொல்ற మచ్చా என்னடா formula ఏಳು గురు ఏం formula మా Walter not Gordon, Walter model. D plus R into E minus D divided by cost of equity, whole thing divided by cost of equity. Now Gordon ka formula is P naught is equal to, if they give you D naught information, D naught into 1 plus growth rate divided by KE minus growth rate. If they give you D1 information, D1 divided by cost of equity minus growth rate. Fine. And we have one more formula, E1 into 1 minus B divided by KE minus BR. That is also one more there. Depending on information, whatever is available, you use. Now let's see what we can use. Company is paying regular dividend. Okay, great. That is their problem again. But they are paying on what basis? Quarterly basis. Sir, when we say dividend in the formula, that is annual dividend. It is annual dividend. As far as my knowledge goes, as far as India is concerned, in a year there are 4 quarters. In 1 year there are 4 quarters. Every quarter, how much dividend are you paying? 3 rupees. You're paying the dividend on a quarterly basis and you're paid how much dividend? How much dividend have you paid? 3 rupees per quarter. In a year, there are 4 quarters, means what is the annual dividend? 3 multiplied by 4, which is 1. Sir, this dividend company is contemplating, thinking to pay or already paid? Check. Company pays regular dividend on the quarterly basis and the last interim dividend declared. Declared means dividend is already paid. So D1 or D0? D0. How much is D0? 12. They have given quarterly dividend. We have to convert it into annual dividend. Same ditto question we have done in class. No change at all. This and all is same. Okay. Now, owing to market research, company ka turnover will increase by 25% growth rate, it seems. Okay, this is not dividend ka growth rate. Sir, we want dividend ka growth rate. They have given 25% as a growth rate for what? Turnover. Turnover means sales. Okay, let's see. In the last 5 years, that is their problem again. Company expects the following rate of return on investment. This only we call it as what? R. Check the R. But R may they have given one number or various probabilities. Okay. If first case happens means the rate of return on investment will be 20%. And there is a 30% probability that first case will happen. And there is a 60% probability that second case will happen and return on investment will be 15%. There is a 50% probability that third case will happen and the return will be 20%. Sir, when they give you multiple scenario and multiple probabilities, what you have to do? Simply multiply. So 20 ka 30%, 20% into 0.3 you do, how much is it? 6%. 50 ka 0.6 you do, how much is it? 9%. 12 ka 0.5 you do, how much is it? 6%. Add all this, how much you going to get? 21%. That is your R. That is the rate of return on investment. We need R, no sir. To calculate Walter and Gordon, we need a R. That is your R. R is how much? 21%. Okay, Saru. Any problem? Ditto question. Just various return you take and various probability percentage you multiply. Same question. No change in our class notes. Everything ditto here. Alright. Now, retention ratio over the last 5 years is, so normally they will give you one retention ratio. Here they have given retention ratio for 5 years. So what we should do? Take the average. Take the average. 40. How do you find average, sir? They have given you 5 years data. How to find average? Add all the 5 divided by 5. 40 plus 65 plus 50 plus 45 plus 30 divided by 5 you do. How much you going to get? 46%. This is what? Retention ratio. Retention ratio is given by the symbol B. Okay. Sir, the moment you know R, the moment you know B, can you find out growth rate? How do you get G? B into R. B is 46%, 0.46. R is 0.21. Multiply. 0.21 into 0.246 you do. How much is the R? You will get R to be 0.0966 or 9.66%. You got your growth rate. That's all it is. Done, Nasaru? Okay, now I think you have all the information. Current interest rate on GOI. GOI as in Government of India. Treasury bond. Sir, government bond, RBI bond and all are risk-free or what is it? It's a risk-free instruments. That means government ka treasury bond is giving 4.5% means what is this 4.5%? This 4.5% is your RF. It's your RF. The moment RF comes, which model? Capital asset pricing model. How do you get cost of equity using CAPM model? RF plus beta into RM minus RF. What is risk-free rate of return? 4.5 plus beta. Beta is how much? 1.3 into R. Market rate of return is only we call it as RM. RM is 12.5 minus RF is 4.5. By doing this, you will get cost of equity using CAPM model to be how much? 14.9%. Because to apply Walter Gordon, we need cost of equity also. So hence we have used CAPM and got cost of equity. All the data available. Can we plug in the formula now? Tell me what is Gordon ka formula again? Gordon sir ka formula. Gordon. They have given D1 or D0. Tell me the formula from D0. D0 into 1 plus growth rate divided by cost of equity minus growth rate. Dividend paid is how much? 12. Into 1 plus growth rate. Growth rate we just now got it to be 9%. Cost of equity just now we got it to be 14.9. Substitute, you will get the price of the share to be 250. Okay. Just that components was not given. We have to find those components here. That's it. Done, sir. This is as per what, sir? Gordon. Only Gordon. In fact, this till here same we have done. Similar question is available in our class notes. Absolutely no change. But one more extra they asked here to find out price of the share using Walter. Here Walter, no, you need to make an assumption. Now stop. Walter ka formula you tell once. You know this actually. You should be knowing this. Not D plus R into E minus D divided by cost of equity. Whole thing divided by cost of equity. Fine. Now anywhere G came in here. In that Walter ka formula, G is there. Now means Walter assumes growth rate or dividend to be constant. Constant. Growth rate is only applicable for Gordon. So that means that one point you should not forget. So in Walter model, we assume that the dividend is a constant. Okay, so don't add growth rate to the dividend. How much dividend you already paid? How much dividend you already paid? 12. This year, if you're paid 12 rupees, means as per Walter model, next year you will pay more or same? Same. Okay, D here becomes 12. Okay, in fact, you know this because in the formula, if there is no growth rate, means obviously growth rate is assumed to be, in fact, there is no growth or no growth? No growth. That means how much will be D here, sir? In this formula, how much will be D? Dividend, D will be dividend paid, which is how much? 12. Plus R. R is missing to us or given? In fact, R and cost of equity is missing or we found out. R is 21%, cost of equity is 14.9%. So R and cost of equity is given. But only one component is missing. What is that? E is what? E stands here in this formula what? In this formula, E stands for what? EPS. Given or missing? Directly not given, indirectly given. How? Simple. B. How much? 46%. B stands for what? Retention ratio. Retention ratio means how much earnings you are retaining. How much earnings you are retaining? 46%. Sir, if 46% of earnings you are retaining means how much earnings are you distributing? That earnings distributed only we call it as a dividend payout ratio. So dividend payout ratio is what? 54% of EPS. 54% of EPS. That means what, sir? Dividend. Indirectly, can I tell like this? Dividend is equal to 54% of EPS. Yes. Dividend, you already know 12. Dividend, you already know 12. 12 is equal to 0.4 times of EPS. Therefore, EPS will be how much? 12 divided by 0.54. How much is that? So you will get EPS to be 12 divided by 0.54. If you do, you will get it to be 22.2. Now you got EPS also. Substitute all the numbers, you will get the formula. So the crux why I took up this question is one, to find out EPS. EPS also you can figure it out. But you should not take. Sir, here you have taken a dividend of, you have added growth rate. For Gordon, you will take the growth rate. For Walter, will you add growth rate or you will take the same dividend? You will take the same dividend and do the calculation. That's all. Because under Walter model, the assumption is the dividend remains constant. That is one I wanted to put it across. That's a highlight of this question. Otherwise, pretty manageable question. Overs. Sir, RTP over, sir. One last question, Macha, and you and I can finish this question. Can we go for that next question? Good kidney question. Management of working capital LDR question. Last day revision question. In fact, I was also, when I read the question, I was feeling happy. Then unfortunately, they brought in some extra parameters and made me unhappy. Because similar question we have solved in the class. This is there. But few extra fittings they brought in. I thought skipping will not make sense. We'll have to do it. Alright. Now, what is this? We will see. Management of working capital. The management of Payasam Limited, they're planning to expand, ante. That is again their problem. Leave all that goalie they've given. That's okay. A requirement of the question, we will come to it. What you need to find is where? You need to prepare estimated working capital statement. You need to prepare. That is a requirement. Okay, na. That is what you need to ask. Sir, you know how to prepare working capital statement. How do you prepare? Just now we prepared in today only. You have to estimate current assets and current liabilities. Yes. Okay. First, let's read the data. Carefully read the data. Here are some new pointers are there. In fact, this question, first part of the question is same. It's a study material question. One part. We have solved also. Few extra fittings. That's all. So it's an added question which was already there. They've added a new pointers. That's all. So not entirely new. Just an extended version of an existing question. Okay. What I'll do? Fine. I think I'll go with this approach. Material used. Material used. Domestic on 2 months credit 9 lakh. Sir, you have an option to purchase the materials locally. You also have an option to import. If you purchase it locally, creditors will give you how many months credit? 2 months. And how much purchases have you made locally? 9 lakh. Okay. If you go for import, you will get how many months credit? 3 months credit. How much purchase have you made? 6 lakh rupees. Once I'll do a thing, I'll not start with the solution. I will read all the data for you so that it becomes easy. Then we will read the question once again and solve the question fully. Okay. Payment of wages. Lag in payment of wages 1 month. Lag means what is this, sir? Outstanding. There is an outstanding wages to the extent of 1 month. What is the total wages? Outstanding we have to find. Outstanding, we have to find what is the total wages they've given. 6 lakh rupees. Okay. Next, lag in payment of manufacturing overheads. Lag means again there is outstanding. How much outstanding? Half a month. But what is the total manufacturing overheads as per them? 26 lakh 40,000. Okay. Sales. Sales, sir, we are doing just like materials. We are selling locally also. We are also doing export. If you sell locally, domestic, we give to our local debtor how many months credit? 1.5 months credit. But however, if you export, if you do an export sales, we will give a credit of 3 months. And export ka selling price is 10% below domestic price. That means export. Sir, if you sell the product, domestic sale if it is 100 means, if domestic ka selling price is 100 means, export ka selling price will be 100 or 10% lower. 10% lower. Me telling or question telling? This is one. Okay, Zaru? This is one. Admin expenses is payable in advance. Advance means it is a current asset or current liability. Current liability. Yes, sir. Sir, if you're paying something in advance, what is it? It's a prepaid expense. No, prepaid expense you show under current liability. Yeah? No, it's a current assets. Yes, no. How many months? 3,60,000 into 2 by 12. Correct? No. Yeah, no. You're looking at me differently, pa. Okay, no issues. Lag means outstanding. So how much is the selling and distribution expense? 3 lakh totally. How much is lag? Full or 1 month? 1 month is outstanding. Outstanding means current asset or current liability. Current liability portion. We'll figure out all that later on. Advance income tax. Sir, if you pay a tax in advance, prepaid taxes and all is current liability or current assets? Current assets. Prepaid expenses. How much have you paid? 25,000 for the quarter. Falling in the next financial year. Next year ka tax you paid this year only. So Darala Prabhu you are. Government is already putting so much of chuna. You already paying more tax in advance that too. Okay, no problem. You have a lot of money. Now look at this question. In this adjustment. Manufacturing overheads is inclusive of depreciation. Yo. Sir, we prepare working capital on a what basis? Total cost basis or cash cost? Cash cost. Cash cost means depreciation should be considered or ignored. But they have ignored or they have included? Included. So what we should do? Can we take this manufacturing overheads includes depreciation? Can we take this number or reduce depreciation? How much is depre? Is inclusive of depreciation of new machinery, and this new machinery ka purchase price is how much? 24 lakh. Depreciation rate is how much? 10%. Calculate depre. 24 lakh ka 10%. How much is that? 2,40,000 is a depreciation included. We have to include or eliminate? Eliminate. That means we can't take this number. From this number we have to reduce 2,40,000. That understanding everybody has got? Carrying on. Next, where is it? Here. Cash gross profit is 20% on domestic sale. Domestic sale ka GP percentage is 20%. Sir, import also will it have same GP percentage? No. Because it's domestic ka and export ka selling price same? No. If domestic if you're selling the product at 100 means export you will sell it at 100 or 10% lesser? 10% lesser as given in the question. That means will export have same GP or lesser percentage? Lesser. We will find out that. This is a common working. This is a ditto. This part is done. It's the same question in our ICA study material and we have done it also in the class. However, to promote exports, Export Promotion Council, some government body, is ready to give you a revenue subsidy. Revenue subsidy. In fact, I discussed this in investment decision. Whenever you receive a subsidy, if it is related to asset, you will reduce it and then calculate depreciation. Sir, if it's related to asset means it's a revenue subsidy or capital subsidy? If it's related to asset means it should be a capital subsidy. Here they mention capital subsidy or revenue subsidy. I mean, so should you reduce this from the cost of the asset and then calculate depreciation? No, we should not do. If you have to reduce means this should not be revenue subsidy. It should be a capital subsidy. Here it's a revenue subsidy of how much? 2.5% of the new machinery purchase. Sir, how much did you buy the new machinery for? 24 lakh. So calculate the value. 24 lakh ka 2.5% subsidy you will get. How much is that? 60,000. They should have mentioned, okay, they've adjusted this subsidy. In fact, we have to adjust this subsidy from your manufacturing overhead itself. In fact, they have not accounted is what they're trying to take indirectly. Okay. That means will your overhead cost will be 240 or there is a gain? Sir, subsidy if you receive means it's a expense or it's a gain? Gain. Alright. So this gain is reduced from manufacturing overhead itself. How much is that gain? 60,000. So if you net off this, how much is your net manufacturing overheads? From 26 lakh 40,000, if you reduce 240, you will get 24 lakh. If you reduce 60 again, you will get what? 23 lakh 40,000. That is a net number of manufacturing overheads. They have not accounted this, is what they had to tell, that they missed out. Maybe they'll correct it. It's okay. Fine now. That subsidy they have not accounted is in what? Indirectly they are trying to say. Fine. We have to reduce this from here only. Next, look at this question. That Parvasam Limited company, they submits LOC, letter of credit, to its bank to avail all export sales value within 9 months. Within 9 months. Within 1 month. What is this letter of credit is? Suppose, sir, I got a customer from Japan. He said, ching chong chung chung chung, I want to buy sales worth of the product worth 100 crore rupees. I didn't understand his language, but I understood Manika language. He told how much money? 100 crores. I am full on the moon. He wants to buy goods worth how much from me? 100 crore. That bugger is asking 5 months credit. How many months credit? 5 months credit. Sir, I don't know that customer. First time I'm transacting with him. How many months credit is he asking? 5 months. Okay. But I don't want to lose this order. I don't want to lose this order because it is a huge order. So in this case, what I'll do is, boss, Japanese customer, I don't know you, you don't know me. No problem. We will transact. Give me an LC. Give me an LC. LC is letter of credit. He told, no problem. I will give you letter of credit. I'll put signature and give you. I'll be like, hey, that is not letter of credit. I don't want you to give the letter. I want your banker to give the letter. I want your banker to give a letter saying what? If that customer defaults, banker will pay me. I can't trust the Japanese customer. Can I trust Japanese bank? Yes. That is your LC, letter of credit. Okay. And that LC I will utilize within how many months? I mean, should I have to wait 3 months to get money from my export customer or only 1 month? I mean, is this 3 relevant for me or only 1 month? We have to take only 1 month because of that LC option. If that LC option was not there, means credit period I would have taken it as 3 months. Because to calculate debtors, remember, you know how to calculate debtors? Tell me how to calculate debtors. In the working capital management today only we did. Annual cash cost of credit sales divided by 12, 365 or 52 into credit period. That credit period we should take 3 or here in this problem 1. 1. For what? Export sales. For domestic you will take same. Okay. That's a drama. And do you think bank will all give this LC at free of cost? What? Their bank is there to do some charity work here. Bank told, no problem, I will give you, but I will charge a fees of how much? 5%. How much ever is your export sales? On that I will put you tuna of 5%. What is your export sale? 24 lakh 80,000. 24 lakh 80,000 is your export sale. Means bank will charge how much for SLC fees, commission? 1 lakh 24,000. So 1 lakh 24,000 is our LC charges. This also is not accounted. We should account it. Okay. In this data, whatever data they've given, in this data, whatever they've given, have they included all that subsidy, LC and all? They've not included. But should we ignore them or consider them? Consider them and work it out. Subsidy we already accounted. We reduced it from the manufacturing overhead. Why? Because this was relating to machinery. And to produce the goods, I need a machinery. I mean, this 60,000 subsidy becomes your indirect cost or your direct. But it's a direct cost or a direct gain? Direct gain. Hence, I have reduced it from overhead itself. Done now. Pakka. Move on now. Where do I say? Here. Company keeps 1 month of stock of raw material and finished goods each. So, stock of raw material is 1 month. Finished goods ka holding period is 1 month. Goods remain in process. Remain in process means WIP. For how many months? Half a month. With 90% raw material introduced in the process. What is this 90%? Degree of completion. For raw material, DOC is given to be 90%. For conversion cost, if they don't give, we will take it as a 50%. We'll see. Company believes in keeping a cash balance of 150. There is a safety margin of 50%. Good question. Okay, sir. 1 or 2 new adjustments. Otherwise, ditto question as per our class notes. We will see one by one what to take care of. First, we will calculate this. Sir, on domestic sales and export sales, we have same selling price or different selling price? Do we know that selling price or we only know sale value? We know only sale value. But it's okay. We can do a small working here. Look at this. excuse me, in fact, one more data is there. Sorry, I did not read that. Raw material imported. Sir, how much did you import raw material? Somewhere we saw here. Raw material ka import is how much? 6 lakh. 6 lakh. Okay, you have imported raw material worth 6 lakh. If you import raw material means it will attract a custom duty of 20%. That means on this raw material you have to pay, on this import of raw material you need to pay extra tax of how much? 20%. That means is your cost 6 lakh or more? So it will be 6 lakh or 20%. Correct? But at the same time you will also get a duty drawback of 5%. Duty drawback means government will give you the money back. How much money back they'll give? 5%. So calculate 6 lakh of 5%. Or directly you can calculate 15%. 20% you are paying to the government. Government is giving you back 5%. That means essentially how much are you paying? 15%. Calculate individually or same, your choice. How much is this? 6 lakh plus 1 lakh 20,000 minus 30,000. So this will be 6 lakh 90,000. That means is my material cost 6 lakh or 6 lakh 90,000? 6 lakh 90,000. That too on what? Domestic or import? Import. That means I should take this number and do my calculation and not this particular 6 lakh. That's another fitting. Okay now. Okay, everybody. So let's starting the working out. First, let's do this export and domestic drama. I want to know on my domestic sales what is my GP percentage, and on my exports what is my GP percentage. Both I want to know. Have they given the selling price or not given? Not given. So you can assume any numbers because we want percentage. You can take any number, answer will be same. For simplicity, I'll assume that let the domestic sales be 100. Instead of, if you don't like 100, you can take 1000. You can take 1 crore. Doesn't matter. Answer will be same. Let the domestic sales be 100. Sir, they told in the question, if you remember, they've given gross profit on domestic sales somewhere. Where is that? The gross profit on domestic sale is how much? 20%. Sir, domestic sales ka sale value I've assumed it to be how much? 100. If this is 100 means the gross profit will be 100 ka 20%, which is 20 rupees. Okay, people. Sir, sales minus GP will give you what? Sales minus GP will give you what? COGS. Sir, if sales is 100, GP is 20 means cost or COGS will be 80 rupees. Any problem? You can call it as cost or you can simply call it as COGS. Done, G? Everybody cool, G? Let's write this now again. Now particulars, domestic and export. I have assumed the domestic sale ka sale value to be 100. If this is 100 means the cost will be how much? 80 and GP will be 20. This is just now we found out. Yes, no? Any problem? Any problem? Any problem? No. Now, if domestic ka selling price is 100 means export ka selling price will be 100 or 10% lesser? 10% lesser, I telling or question told? Question told. That means if this is 100 means export sale will be 100 ka 10% lesser, which is 90. Sir, sale value may be lesser. Cost will change. Cost, if this is 80 means here also cost will be 80. It is just that what, sir? After producing the goods, some goods you are selling it locally. Some goods you are exporting. Cost will change or same only. So here if it is 80 means here also it is 80. That means how much is GP over here? 10. Now we can calculate GP percentage. Tell me how much is GP percentage? How do you get GP percentage? GP upon sales into 100. GP here is 20, sales here is 100. So calculate 3 divided by 1 into 100. That's what I've done. How much is this? 20%. In fact, this we have to calculate or given? This was anyway given. Now I want to know export ka GP percentage. Calculate that. How much is that? GP divided by sales into 100. 10 divided by 90 into 100 if you do, you'll get 11.11%. That is your gross profit on export sales. Yes, people? Till now, no, sir, we found out the value of debtors. How? Cost sheet. Cost sheet, yes. But here we have one debtors or two debtors. One on export, one on domestic. That's the reason we need to have all the data, domestic, export like that. Manageable. So we need to partition and do it. So let's do that now. Let's find out the debtors as an X working out. Okay, first, sir, do you know sales? Actual sales of domestic, do you know? Actual sales. Missing or given? Sir, actual sales. Missing or given? Given. Sir, actual domestic sales and actual export sales, they've given the question. Check the question. Where is the question? Sales, where is it? Domestic sale is how much? 30 lakh. Export sale is how much? 24 lakh, 80,000. Copy. 30 lakh and 20 lakh, 30 lakh and 24 lakh, 80,000. So total if you do, you will get 54 lakh, 80,000. Now do you know GP percentage? On domestic, GP percentage is 20. On export, it is 11.11. Sir, if you know GP percentage, can't you find out GP? How much is GP? How much is actual GP? 20 percentage of sales. 30 lakh or 20% is how much? 6 lakh. 24 lakh 80,000 ka 11.11 percentage is how much? Calculate. 2 lakh 75, 528. Sir, sales you know, GP you know. What you can find? Sales minus GP will give you what? Cost of goods sold. Or you can also call it as cost of production. That's okay. How much is this? 24 lakh, 22 lakh, 4,472. So total if you do, you will get this much number. Till here everybody is comfortable. Huh? Any problem or any reservations? No problem. Absolutely cool. Okay. Now sir, we have got cost of goods sold. In our cost sheet, we used to get COGS. After COGS, what you used to do? Visualize your cost sheet. We need to add what, sir? Administrative expense, selling and distribution expense. We need to add. But hang on, you will incur administrative expense only for domestic sales or both? Both. Selling expense you will incur only for domestic, only for export or both? Both. That means you need to split. In what ratio? Sales ratio. Basis. We have to use one basis. So here the splitting of expense is done in sales ratio. What is sales ratio? 30 lakh is to 24 lakh. 80,000. What is administrative expense? Check the question they have given. The admin expense given in the question. Here administrative expense is how much? 3 lakh 60,000. This admin expense is only for domestic, only for export or both? Both. The total administrative expense is 3 lakh 60,000. You have to split using what ratio? You will split this in what ratio? Sales ratio of 30 lakh is to 24 lakh 80,000. So 3 lakh 60,000 you apportion in 30 lakh is to 24 lakh 80,000 wala ratio. When you calculate, you will get how much? 1 lakh 97,080 apportion for domestic, balance is apportion for export. Till here okay now? Yes sir. Sir, we have only admin expense or also selling expense? Selling expense is also given in the question. If you want quickly, I'll show you. The selling expense is how much in the question? Selling and distribution expenses are 3 lakh. So total selling expense is 3 lakh. You will incur selling expense only for domestic or even for export. So what you will do for this 3 lakh? Same. In what ratio? This 3 lakh you will split between domestic and export in what ratio? Sales ratio. In this ratio you distribute 3 lakh. For one you calculate. 3 lakh in this ratio you distribute. How much are you going to get? 164, 234 and 135 balancing figure. Okay now? Yes. Sir, is this the only cost or there is one extra cost? Sir, you took an LC. LC bank gave it at free of cost or they charged money? Charged money. How much money? 1,24,000. How did you get LC? They told LC ka charges is 5%. LC is for export, domestic sale or export sale? What was the export sales value? 24 lakh 80,000. So the charges is 24 lakh 80,000 ka 5%. How much is it? 124. Make me happy. This 124 you will apportion between domestic and export or only export? Only export. This 124 should come only under export. Done. By doing this, what you will get? Cost of sales. Cost of sales. So what about opening stock of WAP, closing stock of WAP and all? Existing company. If closing stock is 1 lakh means opening stock also will be 1 lakh. Whether you bring it in the format, you don't bring it in the format, it doesn't make a difference. Shortcut. Okay, G. Comfortable, G. So that means how much is cost of sale? This number. Once you get cost of sale, easily you know how to do the debtors. Make me happy. How do you get debtors? Annual cost of sale. This number is for annual basis. I mean, here the data is given in days, weeks or months. So 2761,314 is for 12 months. Are you giving 12 months credit to your domestic customers? No. You are giving how much credit to your domestic customers? 12. Hey, sales much, 1.5 months. So into 1.5 divided by 12 you do. 2761,314 is for 12 months. For 1.5 months, how much? That is a debtors relating to the domestic sales. For export, you give 3 months credit, but will we take 3 or only 1? Why 1? LC. Because of LC. We'll utilize LC within 1 month. So hence, cost of sale for export is 26,27,158. This is for 12 months. Will we take 3 or will we take 1? Into 1 by 12. So this number into 1 by 12, if you do, you will get this much is the debtors relating to export. Adding these two, you will get the total debtors which you have to show in your working capital statement. This is one highlight of this question. This one and one more is there. Rest everything is manageable. Okay. But I'll tell you, this question, even if you don't know anything, still you can do 2-3 marks swaha. I'll tell you last me how. If you don't know any bit of this, if you totally forget this also, now you should not forget, I've told. Okay, in case you forget also, 2-3 marks aram se you'll get. End mein I will tell you how to do that. That much you tell sir, enough sir. Hey, wait. This is okay na. Debtors got total is 564, 094. This is the total debtors you will get. Next is some working note. Material cost. Sir, material cost, I've done a working note. Why? There is some import duty. There is some custom duty and duty drawback. We are yet to calculate that or already calculated? We already calculated that. So here only we have done 6 lakh plus 20% custom duty minus 5% duty drawback. When you did, how much did you get? 690. That's what I've arrived at over here. Okay. In fact, what is the material cost for local? Locally, you purchase material for how much? 9 lakh. Import it is 6 lakh. 90,000. So that means what is the total material cost? 9 lakh for domestic. For import, cost was 6 lakh. Duty was 20%. Duty drawback was 5%. So net cost will become 690. Adding these two, you will get the total material cost to be 15 lakh. 90,000. We have to take this. Yes, sir, people. Yes, sir, people. Correct, sir, people. Next is manufacturing overhead. Why manufacturing overhead? Depreciation. They told in the problem manufacturing overhead is 26 lakh 40,000, but this is inclusive of depreciation. In fact, we eliminated that also. In fact, depreciation is only adjustment or one more? Test your memory. What is one more? Subsidy. Perfect. That's what I've written here. Manufacturing overhead given is 26.4. From that, you have to reduce depreciation of 240. Subsidy of how much? 60,000. So net cost will become how much? 23 lakh 40,000. Since there are adjustment, I've presented this as a separate working note. That's all. Same 23.4. See, I've got it here also. Given number, depreciation reduce, revenue subsidy reduce. So net number is 23 lakh 40,000. Okay, G. And there is one hidden adjustment. That way, this is good problem. Okay, one hidden adjustment. What is that is? Sir, check the question. Check our solution. Sir, we did sales minus GP. What did we get? Cost of goods sold. Cost of goods sold, or you can also call it as this one as cost of production. Many administrative expenses coming later on, correct? I mean, this you can call it as COGS, or you can call it as cost of production. As per our calculation, how much is it? Punch in your number, calculator. Take this number. How much? Or in fact, leave this number. What is the number we should get? 4604,472. This is the required cost of production. Any problem? Any problem? No. Now let's see what is the data they've given in the question. Sir, what is tell me, how do you get cost of production? Cost of production, how do you get? Material consumed plus labor overheads plus manufacturing overheads. Correct? That's it. Anyway, existing company, so opening stock of WIP, closing stock of WIP will be same. Automatically, you will get cost of production. Okay. Now check material consumed. Take your calculator. How much is material consumed given? Can we take the value given, or we have to consider duty drawback and all? After all that, what is the material cost? 15 lakh 90,000. This is material consumed. Next what? Labor cost. Labor cost, I think no adjustment was there. We'll take it from the question. What is the labor cost, sir? Labor cost is 6 lakh. Add. 6 lakh you add. Overheads, can I take 26 lakh 40,000 or adjustments? Reduce depreciation, reduce subsidy. You will get how much? 23 lakh 40,000. So number you have to take is 23 lakh 40,000. Add 23 lakh 40,000. What is it? 45 lakh 30,000. We are getting how much? 45 lakh 30,000. But we need how much? 46 lakh 04,472. That means we have only one overhead, or we have some other overheads also. Other overheads calculated or arrived as a balancing figure. Hidden adjustment. Okay, so these took a difference. You find that is how much? 74,472. This particular domestic calculation and this overhead is a highlight of this question. Other than that, rest everything we can manage. Till here, all the numbers looks fine now. All the numbers looks good. Can we calculate working capital estimate? So what about WIP ka closing stock? You didn't prepare working note only. Directly I'll do it. Closing stock of raw material. Directly I'll do it. Why didn't you do it in previous problem? I wanted you to explain the format. Okay, fine. How will we directly do it now? Take one by one. Now we'll go to the question only. I told no, if you don't know anything in the question, still you can do few marks. Swaha you can do. How? First one. Sir, you purchased materials domestically, and domestically creditor gives you how many months credit? 2 months credit. That means directly you can find out creditors. What is the total purchases? Total domestic purchases how much? Take your calculator. Total domestic purchases how much? 9 lakh. 9 lakh is the value for 12 months. Does the creditor give you 12 months credit or 2 months credit? 2 months. Do it. 9 lakh into 12 by 2 how much? 1 lakh. 50,000. That means the creditor ka value is, creditor ka value here is how much? 1 lakh 50,000. Okay, G. Now you tell me, even if you don't know anything, this one easily you can calculate. Sir, there will be a step marking. There will be a step marking. Even if you don't get debtors value properly, or other overheads properly, at least this and all easily you can calculate. No, lag, gigo and all is directly given. This portion completely you can calculate. That means in 10 marks, at least you will get 2 marks if you do this properly. That's what I'm trying. Even in trickiest and biggest question, 1 or 2 adjustments will be straightforward. Focus on that. You can score. You just need to read that data properly once. Okay. All right. Now next one. We have only domestic purchase or also even import. Import. How much import goods, sir? 6 lakh rupees. Sir, is it 6 lakh or 6 lakh 90? 6 lakh 90,000. Sir, this extra 90,000 you are paying to creditor or government? Government is your creditor. Government is your creditor. Sir, no, that means what? How much do you need to pay to your creditor? Extra 90,000 you have to pay to whom? Not to the normal creditor. You have to pay to the government. Are we calculating government here or creditors ka due amount? Creditors. I mean, should we take 690 or 6 lakh only? 6 lakh. How much credit you are getting? 3 months. So calculate. 6 lakh is for 12 months. For 3 months, how much? 1 lakh ka? 50,000. So the credit with respect to creditors relating to import is 1 lakh ka? 50,000. Directly done without any working note. Simple, no? Why to put working note? If it is simple, we'll do it directly. Okay, 2 or damar. Yes, no? Okay, next one. This and all aram se taka we can do. Lag. Lag means what, sir? Outstanding. How many months lag? 1 month. So what is the total wages cost? 6 lakh. Entire 6 lakh is outstanding or 1 month? So how do you calculate? 6 lakh into 1 by 12. 6 lakh into 1 by 12 is how much? 50,000. So 50,000 is your outstanding wages. Okay. Next, what is the next? Manufacturing overhead. Manufacturing overhead also there is a lag. How much lag? Half a month. But can I take 2640 or 2340? 2340. Okay, now this is actual cost. So we can't take 2640. Sir, this 2640 includes depreciation. Depreciation and all, there is a lag. Lag means a delay in payment. Depreciation you will pay. No. And subsidy amount you have to adjust. So after adjusting, how much is your manufacturing overhead? 23,40,000. So overhead cost is 23,40,000. How much delay? This is total. This is for whole year. So it will be 23,40,000 into 0.5 divided by 12. Why 0.5? Lag is half a month. Half a month means 0.5. Calculate. How much? 97,500. Over but hidden adjustment. What? We have only manufacturing overhead or also other overheads. They said overhead delay. No. How much is the other overhead? We got it as balancing figure. 74. This also you calculate. How much is outstanding overhead? Calculate quickly. 74,472 is for 12 months. There is a delay of 0.5. How much is that? 3103. You can also make an assumption that other overheads are not paid. But since manufacturing overheads there is a delay, it's better to assume that in other overheads also there is a delay. ICI assumes like that. Better to assume in that way only. Fine. This is done. Next. What is next? What else we have? Sales. So will your sales come in working capital statement or debtors will come? Debtors. Debtors now split into 1 or 2? 2. How much? Domestic export. I think they have shown domestic and export separately. If you want, you can combine and show. How much is this number? 345, 164 and 218. 930. Where is it? Debtors. Here. 345, 164, 218, 930. Manageable. Yes. Correct, no, sir. Same number. Okay, na. They're not trusting only. 345, 164 and 218, 930. Got it, Okay, debtors over. Next, what, pa? Next is what? Admin expense. Admin expense is paid in advance. Advance means current liability or current assets. Prepaid expense. So it should come under current assets. How much? Entire 3,60,000 you are paid in advance or 2 months? Calculate. How do you calculate? 3,60,000 is for 12 months. For 2 months, how much? 3,60,000 into 2 by 12. How much is that? Huh? 60,000 is the prepaid admin expense. 60,000 here. Okay, G. Next, G. What is the next one, G? Now you'll go taka. We'll go. Lag in selling and distribution expense. How much lag? Total amount is 3 lakh, but the lag is only 1 month. So calculate how much it will be. 3 lakh into 1 by 12. So what is that? 25,000. So outstanding selling and distribution expense is 25,000. No, not this. Outstanding selling and distribution expense is 25,000. So we have captured. Next, what have they told? From this table, we have captured everything. Next, what and all is there? Check. Advance tax is 25,000. Advance tax is a current liability or current assets? Prepaid tax is what? Current liability or prepaid expenses are what? Asset. So income tax paid 25,000 under current assets. Given a. Okay, next one what, G? First we'll take the question. Next is what? This is over. Company keeps 1 month stock of raw material. Raw material stock is 1 month. Now you know the connection. Either they will give you the data in units or in months. Or whatever. Here it's given in units or date, months, whatever. So how do you calculate stock of raw material? You know this. How do you calculate? You are a producer here. So raw material you will purchase or raw material consumes. How will you take? Annual cost of raw material consumed divided by 12. Do you maintain 12 month stock or 1 month stock? So do you know annual raw material consumed? Yeah. Here. How much is your raw material consumed? 15 lakh 90,000. 15 lakh 90,000. Yes, no, sir. Calculate. Quickly calculate. How much is closing stock? Here only if you want, you can calculate closing stock. 15 lakh 90,000 is for 12 months. For 1 month, how much is it? 1 lakh 32,500 is the closing stock of raw material. That's it, or even you have WIP also. In fact, maybe we'll also calculate this one. I mean, we'll go in order. After, so the company keeps 1 month stock of raw material and finished goods. So finished goods you calculated based on cost of production. Cost of production. Do you know cost of production? Yes, we know. Of course. How much is cost of production? Here also we wrote 46 lakh 4,472. Yes. This is for 1 day or whole year? Whole year. Whole year ka stock you will maintain or 1 month ka? 1 month. Calculate. How much is the closing stock of finished goods? 46 lakh 4,472 into 1 divided by 12. How much is that? 3,83,706. That is your closing stock of finished goods. Only one more we need to find, which is your work in progress. I think they have given the data here for that. Where is the data? Here. The goods will remain in process for half a month. So WIP holding period is half a month. So maybe we can calculate WIP here. With 90% raw material introduced in the process. So that means what is this 90%? Degree of completion for raw material. So now let's calculate WIP. First we will take raw material consumed. How much is raw material consumed, sir? We already have it here somewhere. We wrote. How much is raw material consumed? 15 lakh 90,000. So how do you calculate? We'll take raw material consumed into WIP holding period, which is 0.5. This 15 lakh 90,000 is for 1 day or whole year? Divided by 12 into WIP holding period into DOC. What is DOC? 90%. Calculate. Huh? 5,962.5. That's it, or even labor cost. What is the labor cost given in the question? There is no adjustment in labor cost. So how much is that? 6 lakh. But 6 lakh is for whole year, meaning it's for 12 months. WIP holding period is 0.5. For conversion cost, DOC is not given. So we'll take it as what? 50%. So multiply 6 lakh divided by 12 into 0.5 into 50%. How much? 12,500. Okay, then overhead cost. But only one overheads or two overheads? One is your manufacturing overheads and then is your other overheads. Both you need to calculate. What is the manufacturing overheads? You will take the one they have given or after adjustments? After adjustment, how much is manufacturing overheads? 23 lakh of 40,000. But this is for 12 months. This is for 12 months into WIP holding period 0.5 into DOC 50%. How much? 48,000. 48072. 48750. Then other overheads. What is other overheads? We got it as balancing figure. Other overheads we got it as balancing figure 74472. 74472. This is for whole year, meaning 12 months, into WIP holding period, which is 0.5, into DOC, which is 50%. How much? 155. 1552. This number you'll have to plug in the numbers. What is that? I don't know whether they have calculated separately or totally. I don't know. Or they have calculated separately. How much is the number we're getting? Remember, 59625, 12,500, 48,750, and 1552. 59625, 12,500, 48,750, and 1552. Same number. Okay. Anything? 1 minute. Okay. This is also over. Anything else is pending? Let's see. Company believes in keeping a cash balance of 150, and there is a safety margin of how much? 15%. So cash balance they only given in the question to be how much? 150. Everything I have ticked. This is your total current assets. Here also everything we have ticked. This is your total current liability. Current asset minus current liability will give you working capital you will get. But can we take that, or we have to keep 15% safety margin? This calculation is wrong. You calculate this. 960 to 124 ka 15% you do. 960 to 124 ka 15% is how much? 134. 144,319. The number that they've written is wrong. Okay, it is not 987. This should have been 962. It's a typo. Okay, leave that. That means what is your net working capital? After adding safety margin, it is 11,06,443. This is the question on this particular drum. Okay, people. Everybody cool, people. Yes, sir. Asho. That's all. What else you're looking for? Okay, next question. 1 minute. I think one more is there. Let me review that question. 10th is a theory question, sir. You manage. There's nothing in that. Chapter 1 or chapter 2 they picked up. So this is your summary on RTP May 25. Thank you. Hello, people. So now we'll be discussing the FM MTP 1. Mock paper MTP series 1 for May 25 attempt is what we'll be discussing now. Okay, so overall MTP is pretty straightforward. I think 2 or 3 new questions have been framed. Otherwise, pretty much the repetitive. Previous attempt RTP, MTPs and things, study material question they have taken and made this MTP. Okay, ratio question. Pretty straightforward. They've given goli over here, full mirchi masala, garam masala. We don't want that. Directly we'll come into balance sheet. Share capital, they've given reserves in surplus, preference share capital and debentures. All this only we call it as capital employed. Fine. Here they've given fixed assets, current assets. That's okay. Next, they've given current liability and some more portion. Fine. Sales, they've given COGS, they've given income before, net income before tax. This is your earnings before tax they've given. Average creditor ka days is 60 days. So we get 60 days credit from our customer, from our creditors. And you have to assume 360 days are there in a year. Tax rate is 30%. So what is the requirement? So they're asking liquidity ratio. Liquidity ratio means quick ratio, also known as asset test ratio. How do you calculate that? Quick assets divided by current liability. You can do current assets minus stock, or directly you can calculate quick assets. So what are the quick assets here? What and all we should consider? Should we consider cash? Yes. Take your calculator. 22. Should we take short-term investment? Yes. 25. 22 plus 25. Data should we take? Yes. 30. Stock will we consider for quick assets? No. So add these three. How much are you getting? 77,000 divided by current liabilities. Current liability, we have 4 breakups. So add all this. 10, 15, 5 and 3. So you will get 33,000. So you do that, you will get a quick ratio. So answer is B for Bengaluru. That's the answer for first MCQ question. Next, they're asking sales to proprietary ratio. How do you get proprietary ratio? One straightforward approach, equity share capital plus reserves in surplus plus preference share capital, or you can do fixed asset plus net working capital minus long-term debt. Here we'll do straightforward approach only. So equity share capital is 1 lakh, reserves in surplus 80, preference share capital is 20. Add these three, you'll get how much? 2 lakh. So proprietary funds is 2 lakh. Sales, they've only given to be 1 lakh. They're asking sales to proprietary ratio. So you'll have to do sales divided by proprietary funds. So 1 lakh divided by 2 lakh, which is 0.5. Sir, one good thing about MCQ question is, one, if you get it means, they have 2 requirements. Sales to proprietary ratio you have to find. Also you have to find interest coverage ratio. Sales proprietary ratio is 0.5. Only one option has 0.5, which is what? A. Even if you don't find the other component, you can directly select the answer. But here still any which way I'll do. In exam I'm saying. So interest coverage ratio, how do you get? EBIT divided by interest. Sir, have they given EBIT or earnings before tax? Sir, tell me the format. From EBIT, if you reduce interest, you will get EBT. Correct? No. So now, do you know debt amount? Yes. How much? 50,000. What is the debenture ka rate? 8%. So 50,000 ka 8% if you do, how much is the interest? 4,000 is your interest. EBT they've given, we calculated to be, or they've given it to be 20,000. So that means how much is EBIT? These two ka addition, which is 24,000. How do you get interest coverage ratio? EBIT divided by interest, which is how much? 6 times. So that's the same option. Okay, people? Straightforward. Debtors and creditors ka turnover ratio. How do you calculate debtors ka turnover ratio? Credit sales divided by, they've given only 1 year data. So we will use closing balance of debtors. So you want credit sales. Do you know credit sales? Yeah, how much is that? 1 lakh. If they don't give the data, total sales and credit sales, we assume it to be same. 1 lakh divided by debtors is 30,000. So 1 lakh by 30,000 is how much? 3.33. So that means only one option has that 3.33, which is what? First, you have to calculate debtor, and then the second option is creditor. Debtor ka turnover ratio should be 3.33, which has 3.33 here. C for Chennai. So that's the only option we have. We don't have to calculate the other one in exam. Here we will calculate creditor turnover ratio. Sir, creditor turnover ratio, how do you calculate? We want annual credit purchase. Is purchase given? Purchase given? No. We can find out purchase with the help of COGS. How do you find COGS? Opening stock plus purchases minus closing stock. Here opening stock not given. Closing stock is given, but opening stock is not given. COGS also is not given. GP percentage is also not given. That means we can't use that approach. Another approach is credit days is how much? 60 days. That means here, sir, how much is your creditor ka value? 10,000. 10,000. Yes, no? This 10,000 represents how many days? 60 days. This 10,000 is for 60 days. We want 60 days ka or we want total ka? Total. Total in a year, how many days are there? They're asking us to assume 360. For 360 days, how much is the value? For 60 days, the purchase value is 10,000. For 360 days, how much is the value? When you do that, how much are you going to get? 60,000. So annual credit purchase, you're going to get 60,000. Divided by creditors, if you do, you will get creditors turnover ratio. How much is that? 6 times. Same option. Okay, Saru? Fine. But in creditor turnover ratio, the formula is annual credit purchases divided by accounts payable, no sir. Accounts payable means creditors and bills payable put together, no sir. Here bills payable is also there, no sir. Why did you not take, sir? Sir, you found out purchase how? How did you purchase? See, ratio means random number or related numbers? Related numbers. How did you find out annual purchase here? By taking 10,000. What is this 10,000? Creditors. So your arrived purchases by taking creditors means, correct? No, your numerator, if you have derived by taking creditors, means your denominator should consider bills payable also or only creditors. Only creditors. That's the reason. Since here you derived credit purchases only by using creditors information, in the denominator also you'll only consider creditors and not accounts bills payable. That's what I've written over here. Okay, people. If you are taken COGS information, then COGS considers both bill receivable or rather bills payable and creditors information. Here we did not do like that, hence that's the reason. Or another shortcut is, anyway you know the answer, no? Debtors turnover ratio is how much? 3.33. So only one option which is there is what? C for Chennai. So you don't have to even bother about the other things. Okay, if you're bothering also, this is the botheration. Next one. What is next one? Working capital turnover ratio. Chapandi, how do you get? Sales divided by working capital. How do you get working capital? Current asset minus current liability. This is straightforward, no? That's okay. B, A for alpha is the right answer. Return on investment. So return on investment can be rows. It can be row. Return on equity also. Rows, how do you get? EBIT divided by capital employed. Sir, EBIT is how much? We got it here only. How much is EBIT? 24,000. Take your calculator. EBIT is 24,000. Capital employed is adding all these three. Adding all this, how much is your capital employed? 180, 280, 2 lakh, 50,000. Correct? So do this. If you do it, how much are you getting rows? Rows you're getting to be 9.06%. Any option has 9.06? No. I mean, this return is not based on rows. Let's try with row. Return on equity. How do you get return on equity? Each divided by equity. Each is how much, sir? Each is how much? From EBIT, if you reduce interest, you will get EBT. From EBT, reduce tax, you will get EAT. Preference dividend also you need to reduce. How much is preference share capital? 20,000. How much percentage? 9%. So 20,000 ka 9% if you do, you will get preference dividend. How much is preference dividend? 1,800. That way you will get each. So take the calculator. Each is 12,200 divided by equity. Equity means equity share capital and reserves in surplus, which is 1,80,000. So divided by 180 into 100, you do. How much you are getting? Your calculator is getting 6.77%. That means that also is not used. Okay. There is preference share capital here. There is also preference share capital here. Let's find out the return for a proprietor. Let's find the return for a proprietor. For proprietor, what will you take? Each you will take is proprietor will include preference share capital. For preference share capital, is each available or EAT? EAT. Earnings after tax. Earnings after tax divided by proprietor funds you do. One more option. We don't know. Yeah. EAT is how much? We calculated to be 14,000. Proprietary funds also we calculated here. How much is proprietary funds? 2 lakh. So EAT is 14,000. Proprietary fund is 2 lakh. 14,000 divided by 2 lakh. You do. How much are you getting? 7%. Any option has 7%? Ah, yes. D for Delhi. That means here the return is based on proprietary funds. Permutation combination. That's all. Okay. All right. This is one good MCQ question. I would say that's all. Can I move on to the next one?
Yes.
Okay. And this is a very simple operating income they've given. This is a question based on capital structure. So operating income means EBIT. How much is EBIT? 9 lakh. Cost of debt is 10%. Firm employs how much debt? 30 lakh debt. Overall cost of capital is 12%. Overall cost of capital only we call KO. Sir, KO you know, EBIT you know. What can you find? Value of the firm is given by the formula EBIT divided by KO. EBIT is 9 lakh. KO is 12%. First find value of the firm. How much is that? 75 lakh. Yes, people. EBIT divided by KO. Done. To find value of the firm, there is one more equation. What is that? S plus D. Value of the firm is 70. Sir, if you know value of the firm, if you know the debt, can you find out market value of equity? Yes. S is equal to what? V minus D. Value of the firm is 75 lakh. They only told in the problem we are taking how much debt? 30 lakh. So 75 lakh minus 30 lakh you do. Market value of equity you will get it to be 45 lakh. We have done this. But we didn't read what they asked. What is the cost of equity they asked? For cost of equity, we need each. Now we know the fancy formula. Will we take each or each multiplied by dividend payout ratio? Or you will take the denominator instead of each, we will take dividend. Dividend divided by cost of equity. Correct? Do you know each or dividend payout ratio in this problem? No. We can't use that approach. That is ruled out. Correct? No. Yes, no, people, I'm talking about this. S is equal to each multiplied by dividend payout ratio divided by cost of equity. We did this in your RTP, remember? Yes, in the previous RTP only. Or you can take in the denominator directly dividend. Dividend divided by cost of equity. Information about dividend given? No. Cost of equity also not given. Dividend also is not given. S you know. But if two unknowns are there, can we use this equation or not possible? Not possible. But you know one more equation, you learnt it in your cost of capital. What is that? How do you get KO? How do you get KO? Remember that cost of capital ka table? You take KO is given by weight of debt multiplied by cost of debt. You take weight of equity multiplied by cost of equity. We'll use this and get it. How much is overall cost of capital? Overall cost of capital is given to be 12. Cost of debt is given in the question to be 10. Into weight of debt. Sir, what is the value of debt? 30 lakh. What is the value of the firm? 75 lakh. Out of 75 lakh, debt ka value is 30 lakh means what is debt ka weightage? Out of 75 lakh ka funds, 30 lakh has come through debt means what is the weightage of debt? 30 lakh divided by 75 lakh. Yes, no, this if you do, you will get weightage of debt. Plus cost of equity, we don't know, we'll find it. Into weight of equity. How much is the market value of equity? 45 lakh. What is the value of the firm? 75. Out of 75, 40 lakh has come. 45 has come through equity. So what is the weightage of equity? 45 lakh divided by 75 lakh. When you solve this equation, you will get this. Cost of equity into 45 lakh divided by 75 lakh. This way, when you solve this, you will get cost of equity to be 13.33%. You have to use this equation and got cost of equity. Solve. That's all. Yes, sir. Wait, carry on. Okay. All right. Next is leverage wala question. Firm operates at a production level of 1000 units. Contribution is 60 per unit. So what is total contribution? For 1 unit, it is 60. For 1000 units, it will be 60,000. That is your total contribution. Sir, they have given operating leverage 6. Okay. Sir, how do you get operating leverage? How do you get operating leverage? Contribution divided by EBIT. Do you know contribution? Yes, sir. Operating leverage, you know. Contribution, you know. Can't you find out EBIT? How much is EBIT? 10,000. Okay, Saru. All right. Next, they have given combined leverage. They have given combined leverage. So, if you know operating leverage and combined leverage, can you find out financial leverage? How do you get combined leverage? OL into FL. So, therefore, FL will be what? CL divided by OL. Correct? No? So, combined leverage is 24 divided by operating leverage 6. If you do, you will get financial leverage to be 4. Sir, what is the formula to calculate financial leverage? EBIT divided by EBT. EBIT you already know how much? 10,000. That means now you can find out EBT. Financial leverage is 4. EBIT is 10,000. EBT is not known. Solve and you will get EBT to be 2,500. What is the requirement of the question? If tax rate is 30%, they are asking earnings after tax. They are asking earnings after tax. Till now we got earnings before tax. Sir, if earning, how do you get earnings after tax? From earnings before tax, reduce tax rate. Tax rate is given to be 30%. You will automatically get earnings after tax 1750. So 1750 is B for Bengaluru. 7th question. Okay. 8th question. A very simple question. 10 lakh company has issued 12% debentures of 100 each. Well, say, tell the requirement. You need to find out cost of debt after tax. Anyway, cost of debt is anyway given on what basis? After tax basis. Sir, period is given. Period is given means it is irredeemable or redeemable? It is redeemable. For redeemable debt, what is the formula to get cost of debt? Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Face value is 100 into interest is 12%. So what is the interest amount? 100 ka 12%, which is 12 into 1 minus tax rate. What is the tax rate? 35%. This is this. Plus RV. Sir, they have not told anything about RV. If they don't give, we'll assume that they are redeemed at par. RV is 100 minus NP. Sir, these debentures are redeemable after an expiry period of 7 years. Company is in 35% tax rate. Calculate cost of debt if debentures are issued at 10% premium. That means issue price is 100 or 110? 110. So issue price is 110. Is there any flotation cost? Is there any flotation cost given? No. That means flotation cost is 0. So what will be your net proceeds? 110. Substitute. RV is 100, NP is 110, life is 7 years. Whole thing divided by RV plus NP divided by 2. If you do, you will get 6.7%. That's all. A very straightforward question in my view. Yes, sir. Wait or carry on. Okay. The MCQ question we have done. Now the descriptive question. This is a repetitive question. You know, approach. P1, D1, no, and no, that's a same ditto question. This is such okay. This is a repeat question. Nothing to learn there. Leave that. Now, this leverage, in this MTP, they've given 2 questions. Both are LDR. Leverage ka. Okay. We'll see what we can learn from this. Leverage, they found a good question from this. This is Punya Kalasante. Kalasha Limited, one company. They made a lot of Punya. Okay. Margin of safety is how much? 0.4. Sir, stop. The moment you know margin of safety, sir, this is a leverage questions. The moment you know margin of safety, you can find operating leverage. Simultaneously, we'll go on doing it. How do you get operating leverage? 1 divided by margin of safety. 1 divided by 0.4 you do. How much is your operating leverage? 2.5. Fine. Okay, now. Maybe I'll tell you the requirement of the question so that we will get the things better. You need to prepare income statement. For these sort of questions, first thing is to have the income statement ka format. Whatever data they have given, first plug it into the format and then go on doing the working note. Okay. So what is our leverage ka income statement format? Sales minus variable cost, contribution. Contribution minus FOC, EBIT. From that deduct interest and go up till ish if possible. Otherwise you can go up till EPS also if you want. Okay. Any data they have given, I can plug in my income statement. Margin of safety, financial leverage, debt they have given, tax rate they have given. That means nothing. They have given nothing which fits into income statement. Fine, everything looks like is missing. Interest is given, okay, they're saying, sir, interest rate is given and debt is given, so you can calculate interest. Okay, maybe we can start with that. In fact, we already found out operating leverage. That is done. Okay, Saru, let's do this. But 1 minute. How much is the interest? Debt value is 1 lakh, 50,000. Interest rate is not 9%. Interest rate, post tax is 9%. That means post tax number only we call it as cost of debt. So this is not interest rate. This is what? Oh, cost of debt. Sir, you have a shortcut formula to calculate cost of debt. What is that? Interest into 1 minus tax rate is equal to, or KD is equal to interest into 1 minus tax rate. Cost of debt is 9% here. I here stands for interest amount or interest rate? Interest rate into 1 minus tax rate. What is the tax rate? 25% is 0.25. Therefore, I is equal to 9 divided by 0.75. How much is that? 12%. So the interest rate on debt is not 9%. It is 12%. Everyone, we have applied this. I think in one of the RTPs also, and here also it's okay. Yes, sir. Now you know the interest rate, you know the debt amount. How much is the debt amount? 1,50,000. 1,50,000 ka 12% if you do, you will get the interest amount. How much is that? 1,50,000 ka 12% if you do, you will get 18,000. That's what I've done here. Interest amount is 18,000. Okay, sir. I told you one connection. What is the connection? Remember? In leverage, one connection is ICI ka favorite. Financial leverage and interest. Financial leverage and interest. Do you know interest? Yes. Okay. Check, have they given financial leverage in the question? Yes, they've given financial leverage. That means using this we can find out component. How do you get financial leverage? EBIT divided by EBT. Instead of EBT, you'll write EBIT minus interest. We need to substitute that. That's how you'll get it. Yes, no? Okay. Financial leverage is equal to EBIT divided by EBT, or instead of EBT, you can write EBIT minus interest. Financial leverage is 1.5 given in the question. EBIT we don't know. Interest just now we found out to be 18,000. Solve this equation, you will get EBIT to be 54,000. Okay, people. This we have done. In fact, in many questions, this is examiner ka favorite. Yes, sir. Now, two components we have got. EBIT also we have got. Interest also we have got. Push it into the format. EBIT how much? 54,000. EBIT 54,000. Interest we got it to be 18,000. From EBIT, if you reduce interest, what are you going to get? EBT. Tax rate is 25%. So deduct tax rate. You will get earnings after tax. I mean, still here, all this bottom number we have already solved. Part of this part is done. Next, we will see what information extra they have given to fill in the blanks. So this is done. This is used. This is used. This is used. Okay. Next up, I think we can use this information I think we will use this. PV ratio is 30%. How do you get PV ratio? Contribution divided by sales into 100. Contribution divided by sales into 100. We got contribution, no? We didn't have contribution, huh? Okay, I think we can still get it. Sir, you know operating leverage? What is operating leverage we got? 2.5. How do you get operating leverage? How do you get operating leverage? Contribution divided by EBIT. EBIT you already know. Yes, no? So using operating leverage, we can get contribution. So let's use that. So operating leverage is contribution divided by EBIT. Operating leverage is 2.5. EBIT we got it to be 54,000. So this way when you solve, we'll get contribution to be 1,35,000. Okay, sir? Any problem? No. Then they've given PV ratio. How do you get PV ratio? Contribution upon sales into 100. PV ratio, they've given it to be 30. Contribution, just now we got it 135. That means using this data, what you can find? Sales. Sales will be 4,50,000. That means income statement is done only. 4,50,000 is sales. Contribution, we got it to be 135. So that means variable cost is a balancing figure. 450 minus 135, which will give you 1,35,000. Yes, people, you know contribution, you know EBIT. Can't you find out fixed operating cost? How is that? 135 minus 54, which is 81,000. That means every component of your income statement we have finished. Correct, no? Yes. Okay, next, what did they ask? That's all, or anything else they have asked? Prepare income statement we have done, and also find out the number of equity shares. Number of equity shares. Sir, which formula uses number of equity shares? EPS. What is EPS ka formula? Each divided by number of equity shares. Each we have already found out from income statement. Check, can we find out EPS? We can here. Earnings yield is how much? 12%. Sir, how do you get earnings yield? I told you, when yield comes, MPS will always be in the denominator. So earnings yield is given by the formula EPS divided by MPS. How much is that? 12%, which is 0.12. Correct? And MPS is given in the question. How much is that? 125. So EPS divided by 125 is equal to 0.12. Therefore, EPS will be how much? 125 into 12 if you do, how much you going to get? 50. No? So EPS you have now, no? EPS you have, each you have. Can't you find out number of equity shares?
Yes, sir.
Yeah, how much as per our income statement, each is how much? 27,000. There is no preference dividend. So each and EAT and all will be same. So use your EPS formula. Each divided by number of equity shares. EPS just now we got it to be 15. Each we have it from income statement to be 27,000. Number of equity shares is unknown. Find it.
1,000.
So 27,000 divided by 15 if you do, you will get 1,800. That's all is this question all about. Good one. Good framing. Easy only, but little good framing you could say. Now, according to me, this question is also over. Can we go for the next one? Yeah, next question is also leverage, but this is according to me a good question. Again, a good framing. Financial leverage they have given. The moment you get financial leverage, your mind should automatically go towards interest. Anywhere are you able to see interest? No. But check, they've also given the format. Here in this format, you are able to see interest. Same. Preference dividend is there. We need to find it. Financial leverage ka what is the formula? When preference dividend is not there, financial leverage is given with the formula EBIT divided by EBT. But when preference dividend is there, EBIT divided by EBT minus preference dividend into 1 minus, or preference dividend divided by 1 minus tax rate. Okay, that means we have to use a second formula. Till now, this question was never framed. We never had a financial leverage with the preference dividend, so this got framed over here. That way, good framing. Okay. Now, 1 second. Let's read the data and see. That means we can't do it in a conventional way here. Yes, no? Because you don't know. See here, there are many missing figures. We don't know preference dividend. We don't know EBIT. If you have two unknowns, two figures missing, can you solve an equation? Not possible. Okay, let's see. Let's go with other things. PV ratio. How do you get PV ratio? Contribution and sales. Have they given sales or contribution, or both are missing? Both are missing. So this is currently not helpful. Tax rate not helpful. Depreciation not helpful. Preference dividend is 15% of operating profit. Operating profit only we call it as EBIT. So they are saying preference dividend is 15% of EBIT. Not me. Question. Correct now? We will see. Then they have given cash break-even point. Cash, not even break-even point sales. They have given cash break-even sales. Sir, how do you get cash break-even? Break-even sales, how do you get? Fixed cost or fixed operating cost divided by PV ratio. That is equal to break-even sales, which is equal to 2,25,000. Okay. Do you know PV ratio? Yes. How much? 40%. I mean, this is our starting point. Through this, we can find out fixed operating cost. Is it okay, people? Yes. But there is one small catch here. What is that? Sir, this is your break-even sales or cash break-even sales? Cash break-even sales will include all expenses or only cash expense? That means by doing this, will you get total fixed operating cost or cash fixed operating cost? Cash. But there is also depreciation. So you, by doing this equation, you will get cash FOC. To this, you add a depreciation, then you will get the total FOC. That's the cash. Understood, everybody? So solve this first. Cash break-even sales is 225. That's what where is that? Here. Break-even sales. How do you get break-even sales? Formula is fixed cost divided by PV ratio. Since they have given cash break-even sale, you can reconstruct this formula. If this is cash break-even point, means is this total fixed cost or cash fixed cost? Cash fixed cost means depreciation will be included or excluded. Excluding fixed cost, this PV ratio is given to be 40% or 0.4. Cash break-even point is given in the question to be 2,25,000. Solve this, you will get fixed cost excluding depreciation. How much? 90,000. Any problem? We want excluding depreciation or total. In our income statement, we show only what? We show excluding depreciation or total fixed operating cost? Total. That means this is the fixed operating cost excluding depreciation. How much is depre given? 10,000. That means the total fixed operating cost is 1 lakh. So we can go back. I think even this question also, the requirement is, I'll show you the requirement. You need to prepare income statement. Okay, first have the format. So I think we already have that format and we can figure out fixed operating cost. How much is fixed operating cost ka value we got? 1 lakh rupees. This value we have already got it now. Yes, people. Okay. Now Now, what else can we use? Let's think about that. This is over. Equity share capital, use this information. Reserves and surplus is 35. Okay, that will not help us any which way. That means here also interest expense is given to be 57,400. If you want an income statement, you can update interest to be 57,400 because it is given. Right? So that means many things are missing. How to do it? You remember in RTP question, we used one method for closing stock and debtors. What was that? X method. X method. Here also same. X method we have to use. Now, preference dividend, they have linked it with something. What is that linkage? Preference dividend is 15% of operating profit. That means in this problem, operating profit will assume to be X. Let operating profit be X. Then we will be able to solve this. That's all is the highlight of this question. If this clicks, problem is over. Only this is the highlight of this. Let EBIT be X. If EBIT is X, means preference dividend will be 15% of EBIT, which will be 0.51X. This I'm telling or question told? Question told. You got it. Okay. Now use financial leverage ka question. Financial leverage ka equation. Now here this is a financial leverage without preference dividend or with the preference shares. With the preference shares, what is financial leverage ka formula? EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. Now EBIT I have assumed it to be X. Okay. Divided by, instead of EBT, what can I write? Instead of EBT, what I can write? Instead of EBT, I can write EBIT minus interest. Minus preference dividend. Instead of preference dividend, I'll write 0.15x divided by 1 minus tax rate. Now everything is only one variable is missing, which is what? X. Now this EBIT also I will write it as X only. Financial leverage is given in the question to be 4. Yes, this is X. EBIT is again X minus interest is given in the question to be 57,400 divided by 0.51x divided by 0.7. These two you solve off. 0.15 divided by 0.7 if you do, how much you will get? 0.15 divided by 0.7 if you do, you'll get 0.21. Now we'll have to solve this, that's all. Or if you want, you can solve this further also. 4 is equal to X into, this is X means this is 1X. 1X minus 0.21 if you do, how much you're going to get? 0.7X minus 57,400. Now you solve the equation, you'll get X to be how much? 106,296. X is assumed to be what? EBIT. Now EBIT you got a EBIT if you get means automatically you also know preference dividend. Preference dividend is 15% of that. Calculate 106,296 ka 15% if you do, you will get preference dividend this particular value. Now over. Literally question over. So X EBIT is 106, preference dividend is 5944. Update that. EBIT we found out, preference dividend also we found out. Check the data. We are here now. We are here. Sir, EBIT is known, interest is known. That means from EBIT, if you reduce interest, what are you going to get? EBT. Tax rate, they have only given in the question to be 30%. No, sir, it's question mark. No, sir. Here they told question mark. No, sir, tax rate is question mark where? Here they told tax. Sir, tax amount is question mark. Tax rate they gave in the first table only, first data only. How much is that? Check here. Tax rate is 30% given. Okay. So tax 30% you reduce. You will get earnings after tax. Preference dividend just now we got. So automatically you will get what? Ish. Okay. Now can we figure out the above table? Yeah. Sir, EBIT is EBIT, you know, FOC you know means contribution, can't you find out? So, these two if you know means can't you find contribution? Yeah, how do you get EBIT? Contribution minus FOC. That means how much will be a contribution? These two ka addition. Yeah, yes, no? So how much is contribution? 206, 196. So till contribution we figured it out. Yes, people. Yes. Sir, they also gave you PV ratio. They also gave you PV ratio. How much was PV ratio? We used it also here. PV ratio is 40%. How do you get PV ratio? PV ratio is given by contribution divided by sales into 100. PV ratio is given to be 40%. Or you can take it as 40. If you're multiplying by 100, take 40. Here, if you're not multiplying by 40 means, if you're not multiplying 100 here, then you take 0.4. Like that. Okay, that's the presentation. I'm multiplying by 100, so I'll take 40. So PV ratio is 40. Contribution, do you know? Yeah, just now we got it. How much? 206,296. Sales, we don't know. We can find out sales. How much is sales? When you substitute, you will get sales to be 515,740. Yes, sir. So sales also we got it to be 515,740. Sir, contribution, you know, sales, you know, means variable cost is missing. Can't you find? Yeah, basically These two ka deduction difference. How much is that? 3,09,244. So income statement, anything pending or everything ticked. That's all. So the highlight of this question is you should assume EBIT to be X. If that clicks, almost everything is done. That's all it is. Now, whenever they give you one number is this much of that number, like preference dividend, if they say is 20% of EBIT, then your mind should run that. We have to assume EBIT to be X, like that. So when they establish that linkage, when two unknowns are there, assume one variable to be X. That way you will be able to solve the question faster. Okay, income statement was the first requirement. Then they asked what, sir? OL, FL, OL and CL. FL is anyway given. This is any dhamma? No. OL for what formula? Contribution divided by EBIT. Everything you know. How do you get combined leverage? OL into FL. FL is anyway given. OL we found out. So first requirement is done. Or rather second requirement is done. Third one is what, sir? These two are done. Next, they are asking percentage change in EPS if sales increases or reduces by 7%. They are saying sales and EPS. Sir, which leverage measures the relationship between sales and EPS? Combined leverage. So we have to use this. What is combined leverage ka percentage formula? Percentage change in EPS divided by percentage change in sales. Combined leverage, we got it to be 7.76. EPS ka change we have to find. Sales ka change they have given in the data to be 7%. If this is 7, how much will be EPS change? 54. Sir, if sales, they told when sales increases by 7%, what will happen? When sales decreases by 7%, what will happen? Sir, if sales increases by 7%, what will happen to EPS? EPS also will increase by how much? 54. If sales reduces by 7% means EPS also will reduce by same percentage. You need to call out that. Done. Next, what is the next? Return on equity shareholders funds. Important. How do you get ROE? Return on equity. Each divided by equity. Okay, how much is each? Just now we got each to be 18,000. 18,283 divided by equity. What is your equity? Equity here refers to what? Equity share capital plus reserves and surplus. Equity share capital is 1 lakh. Reserves and surplus is how much? 35,637. How much? Hang on. Sir, reserves and surplus is 35. This is what? Till last year. Till last year. Current year also you made how much each year? 18,283. Do not forget to add that. Okay, each means total. Sir, we want total reserves and surplus. Till last year. Okay, your reserve and surplus balance is how much? See, this is as on 31st March 2023. We are working this data from 31st 2023 or 23-24. 23-24 means year begins on 2023 and year ends on 31st March 2024. This is our current year. Yes, no? Current year. So we want reserves and surplus at the end of current year. Yes. So now they have given reserves and surplus as on 31st March 2023. So that means what is this? This is reserves and surplus ka opening balance. How much is that? 35,637. Current year also you made profit, no? How much current year profit you made? 18,000. Just now we locked it. Okay. 18,283. Because you have not distributed any dividend. If you don't distribute any dividend means reserves each only will become retained earnings. Yes, no? That means what is your reserves and surplus ka closing balance? Now this you should not forget to add it. That's what is. Everyone got it? Huh? 53,920. That means what is your equity in this problem? Equity share capital is 1 lakh. Reserves and surplus is 53,920. That means the total number is 1,53,000. You have to take this number. Many students will forget to take current year ka ish. Okay, that is one good adjustment here. Easy, but it should click. Okay, so that is what I've done over here. Here. Each is 18,000. Return on equity is given by the formula each, which is 18,283 plus equity. Equity share capital is this. Reserve and surplus ka opening balance is this. Plus current year ka retained earnings is 18,283. Take that and then calculate return on equity. You will get 11.88%. Good question. This is a good adjustment in this question, especially this particular number. You should not forget to add that number. That's all. That is a highlight. Okay. Next. What is the next? Amount of debt. Sir, you need to find debt. How do you find debt? Interest amount divided by interest rate. Amount of debt if post-tax interest rate is 6.65. Sir, this is interest rate or post-tax? Post-tax means this becomes your cost of debt. How do you get this? Interest into 1 minus tax rate. That is 6.65. Interest is how much? We don't know. Into 1 minus tax rate. Tax rate, I think we saw it previously only. 25%. Huh? No, 30%. So solve, sir. So I is equal to 6.65 divided by 0.7. How much? Huh? 9.5%. That is your interest rate. How do you get debt amount? Interest amount divided by interest rate. How much is the interest amount they have given in the question? 57,400 divided by interest rate, which is 9.5%. If you do that, how much you going to get? 6,04,210. That is your debt ka value. 5 requirements. Good question. Easy only, but still you need to pay attention. 1 or 2 adjustments can kind of make you waste time. Yes, people, this question is also over. Okay, next question is a repeat question. Capital structure ka repeat question. We are not doing that. It's the same class question only. Working capital management also same question we have done. It's a repeat question. 3A is a capital structure ka again repeat question. Ditto, no change. Okay, only a new questions we are doing it. Okay, last question for the day. Investment decision LDR question. Last revision question. Ayo, sir. No, easy only. Don't worry. Okay. All right. Look at this question. Millennial Limited. It's a quick commerce company. That's okay. Again, their problem. They're in the business of delivery. They're engaged in the business of deliveries, and they need what, sir? Delivery vehicles. Like your Flipkart and all, or Amazon. To deliver the goods, they need vehicles. So now they've given some option. What options we will see? Company has 2 different options. Option 1 or option A. They can buy 4 brand new electric delivery vehicles that would cost 1,50,000 each. So carefully read the data. This is 1,50,000 each. That means what is the total cost? 1,50,000 is for 1 vehicle. 4 vehicle it will be 6 lakh. This is one option you can buy. And you also have to pay a GST of 5% which is not eligible for set off. Meaning input tax credit not available. You will pay GST but you will not be able to get it back. That means what, sir? This 5% becomes your extra cost. So is 6 lakh is your cost or plus 5%? 6,30,000 becomes your year 0 ka outflow. Investment decisions, don't worry. We need inflows and outflows. So at year 0, the outflow is 6,30,000. Manageable till here? Okay. Electric vehicle will be eligible for a government subsidy of how much? 20,000 each. 20,000 each. We have 1 vehicle or 4 vehicles. That means how much is the total subsidy? 80,000. But this would be received only at the end of the year. So that means what? Will you consider for year 0 or year 1? Year 1. Okay, 1 minute. Hang on. Give me that format of cash inflows we prepare for investment decision. We need cash flows, but usually they will give you sales. What you will do? From sales, you reduce all the expenses. Okay, you will get including depreciation. Also, you need to reduce. Okay, and then you will get earnings before tax. From earnings before tax, reduce tax. You will get earnings after tax. Then 6 adjustments. Add back depreciation. Add back salvage value. Add back working capital. Add back or add or minus opportunity cost. Then additional investment or whatever additional cash flows and short-term capital gain or short-term capital loss. Now this subsidy you are receiving when? Subsidy you are receiving at the end of first year. I mean, this is your additional cash investment or additional cash receipt. Receipt. I mean, this 80,000 I should consider as an outflow or an inflow. Inflow for year 0 or year 1. Yeah. So I'll do a thing. As and when I read the data, we'll have this format ready and punch off that number. How much is the subsidy? 20,000 per vehicle. How many vehicles? 4 vehicles. That means how much is the total subsidy? 80,000. When it should consider? Year 1 as a negative number or as a positive number. If it's outflow, we show it as negative. Inflow means positive. So this is your year 1 and you have to show subsidy of 80,000 as a positive number. Considered. Okay, sir, like this we'll tick off. Done, because many adjustments will be there so that we don't have to read the data again and again. Okay. And year 0 outflow also we have figured it out. We bought the vehicle for 6 lakh, GST is 30, so totally is 6 lakh 30,000. That portion also we have ticked off. Okay, go back to the question now. What else they asked? The life of the vehicle would be 10 years. I mean, this will help us to calculate depreciation. Okay, 1 minute, hang on. Depreciation could be SLM or WDV. So let's not hurry. Let's read the data and then figure it out. Scrap value is 10% on gross cost. What is your gross cost? 6,30,000 into what? Gross cost means before depreciation. Before depreciation, the value of asset is how much? 6,30,000 into 10% is how much? 63,000. This is what, sir? Inflow. When? When will you get this inflow? At the end of the year. That means this is an inflow for year 10. So in my year 10, I should see 63,000. Am I able to see? This is your year 10 salvage value. And how much is that salvage value? 63,000. Considered. Yes. We know the format now. So we can go on punching the numbers. That's all it is. Lengthy question, but very easy. Okay. Yes. Next question. Next adjustment. Then we have option B. Option B will not read now. First, we'll finish off option A fully. Next, check. Millennial Limited applicable tax, corporate tax rate and capital gain. In the previous problem, one problem we did on marathon, but they asked us to ignore capital gain. Here, ignore or pay. Pay both normal tax and capital gain tax is how much? Same, 15%. Where, and you know this, capital gain will come usually in case of what? Straight line method or WDV method? WDV method. Whereas vehicles would be depreciated or 20% on WDV basis. Okay. Yes, people. And we know because it is a WDV method, every year depreciation will change. That's the reason we had 1 column or 10 columns. In our forum, that's the reason you see 10-year columns because of culprit WDV. Otherwise, we could have done it in the easy format. So what is the depreciation? Tell me, sir. You bought the asset for how much initially? 6,30,000. So first year, what will be depreciation? We'll use shortcut method. You bought the asset for 6,30,000. Depreciation is 20%. 6 lakh you bought the asset for, 5% GST you paid, which you will not get credit. So cost of the asset will become 630 into 20% is the depreciation. How much? 1,26,000. This is what? First year ka depreciation. Then I told you one shortcut method. What is that? Sir, 20% is depreciation. Then go on multiplying 0.8. Go on multiplying 0.8. So first year ka depreciation is how much? 1,26,000. Then go on multiplying 0.8 or 80% you multiply. 1,26,000 ka 80% is how much? 1,08,000. That is your second year depreciation. Third year if you want means take this number and multiply 80%. If you want next year depreciation means take this number and multiply 80%. Like that you do it for all the 10 years. Should I have to tell? This way if you do shortcut method you don't have to put a working note. If you want you can put the working note, no problem. But this is the one shortcut method which we found, which we discussed in marathon, which we applied. Okay, people. So this also I can tick off. Yes, no, depreciation part I can fully tick off. Now come back to the data. What else information they've given? Short-term capital gain loss, we will do it at the end. Let that be on hold. Now, QCOM, this company ka industry required rate of return is how much? 15%. This only we call it as cost of equity or also known as discount factor. In fact, this is not cost of equity. This is KO. All right. So also known as discount factor. How much is discount factor? 15%. Evaluate both the options and advise the best one. Now they've given revenue and cash expense. And cash expense. Cash expense means including depre or excluding depre. Excluding depreciation. Revenue is how much? 15 lakh per annum. Cash expense is how much? 10 lakh per annum. This is changing or same every year? Same every year. So anyway, we want cash flow. But they will not give you cash flow. They will give you revenue. Revenue is how much here? 15 lakh. From revenue, we have to reduce all the expenses. Here, how many expenses are there? 2. What are those? Cash expense and depreciation expense. How much is the revenue? 15 lakh I've considered. Say, any change or same number? Same number. Cash expense is how much? 10 lakh. Different or same number? Same number. One more expense is for depreciation. From sales, if you reduce all expenses, you will get what? Profit before tax. Tax rate somewhere they must have given. Check where is the tax rate. Tax rate for both normal tax rate and capital gain tax rate is how much? 15%. So reduce tax at the rate of 15%. From profit before tax, if you reduce tax, what are you going to get? Profit after tax. Any confusion in this number? Just the calculation. Conceptually, any problem is there or ditto? Ditto. Now you got profit after tax. 6 adjustment. What are those? Add back depreciation. This is your depreciation. Add back the same number. Over. Next one. Salvage value. Already considered. Next. Opportunity cost. Not there. We read the data. Next. Working capital. Not there. Opportunity cost, working capital both are not there. then additional investment, or it could be a receipt. Here it's an additional investment or subsidy. Subsidy. Outflow or inflow? Inflow. Already considered. Okay, sir. Last component is short-term capital gain or short-term capital loss. How do you get short-term capital gain or loss? This also you know. At the end of 10th year, first find WDV. Compare WDV with salvage value. Okay. If you have sold it at a higher price, means short-term capital gain. Lower price means short-term capital loss. Okay. Now it's a WDV method. You can put up a working note or directly calculate WDV. How? Sir, how much did you buy the asset for? How much did you buy the asset for? 6,30,000. Every year, how much are you depreciating? Sir, if you buy the asset for 100 rupees and 20% if you reduce for depreciation, means what will be WDV? 80%. So what you do is take 6,30,000. Take 6,30,000. We want WDV at the end of 10th year. WDV represents what platform? 80%. So 6,30,000 ka 80% you do, or 0.8 you do. How many times? 10 times, because we want WDV at the end of 10th year. Normal ways, take WDV, go on reducing every year ka depreciation. That is one way. Okay. Or shortcut method is take the 6,30,000 and multiply 0.8. Why 0.8? 20% is depreciation. After depreciation, whatever value you get only is called as WDV. So this is 0.8. We want WDV for which year? 10th year. So you multiply 0.8 10 times. So this is a shortcut method. Otherwise, you do the normal one. Normal one also I have shown in the table. Opening WDV minus depreciation will give you closing WDV. Like that, you can prepare a working note, or this is shortcut method. So 6,30,000 into 0.8, you press 10 times. How much you going to get? 67,645. That is the WDV. But you sold this asset for at what salvage value? You sold it at a salvage value of 63. Sir, 67,645 is the WDV, but you sold it only for 63. Happy or sad face? 67 is a worth, but you sold it only for 63. That means it is a short-term capital loss. How much? 4646. On losses, will you have to pay tax or you will get tax benefit? Tax benefit. And fortunately here, short-term capital gain ka tax rate is also 15%. So 4466 ka 15% if you do, it is 697. Which year we should consider? And we should consider this as what? This will come when? Which year? 10th year. This is a tax benefits, outflow or inflow? Inflow. 10th year ka inflow, you need to consider this. This is your short-term capital loss. 10th year ka inflow. Okay, people. Adding all this, now it's the same step. Adding all this, you will get cash, net cash inflow. All these are on present value terms or future value terms?
Future value.
Multiply discount factor at 15%, you will get present value of cash inflow. Adding all this, you will get total present value of cash inflow to be this much. Okay, G. We want NPV because decision and all, if they say decide, always decide based on NPV. So how do you get NPV? Present value of cash inflow minus present value of cash outflow. So outflow we already found out. You get it to be how much? 16,41,426. This is option 1 ka NPV. Lengthy but difficult or same? Conceptually difficult? No. When you put it up, yeah, it will take some time. Challenge is in this problem again the time. Okay, this problem over or option A over? Option A over. There is one more option. Can we review that? We have not yet read that. Okay, let's find out the option B now. We have another alternative. What is that? The other alternative is to buy the vehicles on a second-hand basis. Either you can buy a new vehicles or you can purchase a second-hand delivery vehicle. Second-hand will cost how much? 1 lakh. Okay, same. How much new vehicles you purchased in the previous option? 4. That means how many second-hand vehicles you have to purchase? 4. Each will cost how much? Each will cost 1 lakh. So totally it will be how much? 4 lakh. Like last problem, we had GST. Okay, here we have GST. Here. No, maybe GST provisions does not allow. I am not sure about the GST provisions. Maybe on second-hand vehicle you will not have to pay tax, GST or whatever. I don't know. You ask me GST faculty. I don't know that. Okay, so that means what is the cost now, sir? What is year 0 outflow? 4 lakh rupees. There is no GST information. Okay, sir. Done. This old vehicles will only come for 5 years. Previous man? 10 years. Sir, unequal life, sir. EAC you have to do, sir. Samadhana. Wait. This will come for how many years? 5 years. After that, what you have to do? After 5 years, company has to done some capital work, meaning you have to do a repair. Normal repair or capital repair? I mean, there's a small expenditure or major expenditure. This you will transfer it to P&L or you will capitalize. Capitalize. After 5th year, you have to incur how much, sir? 70,000 each For one vehicle, 70,000. For four vehicle, it will be how much? 2,80,000. This is what? Outflow. Which year? 7th year of 5th year. When you buy a second vehicle, it will last for 5 years. At the end of 5th year, again you need to incur a capital expenditure of 2,80,000. Repair work you have to incur, which is capitalized. Okay, Saru? Alright. After that, they can be used for another 5 years. That means the total life is how much? 10. Previous option also had 10. Unequal life or equal life only? Equal life. ESC required or not required? Not required. Right? Scrap value. Or is it okay if I'll bring in this data? Simultaneously, we will solve. Sir, at year 0, what is the outflow? 4 lakh. So, we'll tick off that. This is the second option. So, outflow at year 0 is 4 lakh. We already found this, and for NPV also, we'll deduct this off. Okay, and then one more we saw. What is that one more data we got? You have to incur 70,000 additional expenditure. Which year? 5th year. One vehicle, 70,000. How many vehicles we have? 4. So, how much is the total? 280. That only we call it as what? Additional investment. When it will come? Year 5. How much value? 2,80,000. Ticked off. Done now? Okay, can I move forward? Come back to the question. What else they asked? What else they gave rather? Okay, here over. The scrap value of the spare parts replaced at the end of 5th year. Since you are doing some major repair work, at the end of 5th year, some scrap parts are there which you can sell. When? 5th year. And how much you will get? 32,000. 32,000 each or 32,000?
32,000.
That means this is total. When you will get? End of 5th year. So outflow or inflow? Inflow for which year? 5th year. This only we call it a salvage value. Okay, of salvage value we have a format. So in 5th year, salvage value 32,000 should be considered as an inflow. Considered this is your salvage value at the end of 5th year, year 1, year 2, year 3, year 4 and year 5, 32,000. Considered as an inflow. So positive number. Yes, sir. Okay, next. What is next to? Where is it? Whereas at the end of 10th year, the scrap value of vehicle will be 4,000 each. How many vehicles?
4 vehicles.
4. One vehicle can be sold for a scrap of 4,000. So, scrap value at the end of 10th year will be what? 4,000 into 4, which will be 16,000. This is what? Inflow for 10th year. Correct? Correct. So, 16,000 you should consider as a salvage value again in second option. Salvage value again, 16,000 as an inflow. Consider. Same format. Okay, G. Next, G. What is the next one, G? That's all, no? Yeah. Capital gain tax and depreciation. Depreciation is one highlight of the second option. Depreciation, you have to charge at what rate? 20%. Take your calculator, all of you. So now in second option, we are buying a second-hand calculator. Second-hand vehicle. That will be too much. Sir, how much are you buying the second-hand vehicle for? 4 lakh. Should we have to do calculating depreciation normal way or shortcut way? But hang on. This vehicle will last for 10 years or 5 years?
5 years.
What is the depreciation rate? 20%. So first year the depre will be how much? 4 lakh or 20%, which is how much? 80,000. This is for year 1. For year 2, what you will do? 80,000 ka 80%, which is how much? 64,000. For year 3, it will be 64,000 ka 80%. How much is this? 51,200. For 4th year, it will be 51,200 ka 80%. 40,960. Then it will be 40,960 ka 80%, which is how much? 32,768. So that we have to reduce as depreciation, and option number B. Have I done 80, 64, 51,200, 49,60, 32,768. Done, people? Okay. Now at the end of 5th year, this asset is sold or it's getting repaired? Repaired. But you also sold some parts. Sir, in income tax method, you calculate depreciation based on a block. How do you get the block value? Tell me. You take the WDV before sale. You have to take the WDV minus sale value and add the purchase cost. Correct? So take a calculator. How much did you buy the asset for? Shortcut method you can do, or you can do normal way also. 4 lakh is the WDV at the beginning of the asset. How much have you depreciated the asset for? This much. So reduce all this depreciation. Either you can do directly 0.8. 5 times if you press 0.8, you will get same number. Or you can take 4 lakh and reduce all this number. Reduce 4 lakh minus 80 minus 64 minus 51,200 minus 49,60 minus 32,768. If you do that, what is your calculator showing? 1,31,072. That is one option. Or another shortcut. take 4 lakh and multiply 0.8 how many times? 5 times. Okay, that way also you'll get the same number. Your call. Okay. Now yes people, at the end of 5th year, did you sell any spare parts? You did not sell the whole asset, but did you make some part sale? Yes. What is the salvage value of that part? We already wrote here. Salvage value of that part is 32,000. What we should do under block method? When you sell, you have to reduce. So minus sale value how much? 32,000. Okay, sir. Did you only do this or you did a capital expenditure? How much? 70,000 per vehicle. How many vehicles are there? 280. 4 vehicles are there. So total value will be 280. This is like your purchase cost. For purchase cost, what you'll do? Add. So 280 you add. When you do it, you'll get the revised WDV at the end of 5th year. How much is that? 3,79,072. Okay, sir. If WDV changed means depreciation will be same or it will also change. From year 6th onwards, you will start depreciating the asset on this. So next year 6 ka depreciation will be 379 ka 20%, which is how much? 75,814. That's what I've written here. Okay. Thereafter, should I have to worry or shortcut method? Next depreciation will be 75,814 ka 80%. So 75,814 ka 80% if you do, 6652. Take 6652 into 80%, 48. Take this number into 80%, 38. Take this number into 80%, 31,054. That's how you get the depreciation for the remaining years as well. Okay, we will. Done. Sir, whether you go for first option, that's all, no? I think anything else they gave or that's it. That's it. Sir, whether you go for first option or second option, revenue and cash expense will be same. Revenue is how much? 15 lakh. Cash expense is how much? 10 lakh. This is same. This is 15 lakh for all the years. Cash expense is 10 lakh for all the years. Depreciation we have already reduced. From sales, if you reduce all the expense, you will get profit before tax. From that reduced tax, you will get profit after tax. Then 6 adjustments. That is depreciation, add back depreciation we have considered. Then salvage value considered. Here 1 salvage value or 2 salvage value? 2. Because some spare parts you sold at the end of 5th year. Whole asset, second hand asset you sold at the end of 10th year. Both the salvage value we have considered. That is done. Then working capital not there. Opportunity cost not there. Then
Short-term capital.
Short-term capital gain we'll do next. Then is additional investment. Additional investment here we have. How much did you invest? End of 5th year, 70,000 is the repair cost for 1 vehicle. So total it is 2,80,000. That we already considered. Okay. Last will be short-term capital loss or short-term capital gain. Let's find out. Okay. How to find out? Simple. How much did you buy the asset for? Or I think instead of starting from the beginning, we already have no. What is the WDV at the end of 5th year? We'll start from here no. Why to do again from the beginning? How much is the WDV at the end of 5th year? 3,79,072. Then go on reducing depreciation. How much is depreciation? This number. Or you can do into 0.8 into 0.8 into 0.8 5 times. That way also you will get. Okay. Or you can reduce this depreciation. Reduce if you want. From 3,79,072 WDV at the end of 5th year. Reduce 6th year ka, 7th year ka, 8th year ka, 9th year ka depreciation. If you reduce it, you will get WDV at the end of 10th year how much? 1,24,214. Okay. Now short-term capital loss or gain because block is there or block gone. At the end of year when you sell all the vehicles, is there any vehicle or all the vehicles gone? And all the vehicle gone, block has ceased. That's the reason they have given you capital gain tax. Nowhere they have mentioned block is lost. But the moment they say capital gain tax is 50%, it is implied that block is there or block is gone. Block is gone. How do you calculate short-term capital gain? WDV before sale minus compare it with the sale value. Now, how much is the salvage value of the asset at the end of 10th year? How much did you sell it for? 16,000. Sir, book worth of the asset in your books is 124,214. You sold it only for 16,000. Yes, sir. Correct. That means what is this? Gain or loss? Loss. This only we call it as short-term capital loss. On this, you will get tax payment or tax benefit. How much benefit? Capital gain tax benefit is 15% as given in the question. So 108,214 ka 15% you do, you'll get 16,232. What should we take this number as? Where we should consider? 10th year as an outflow or as an inflow? Inflow. Considered yes, short-term capital loss ka tax benefit, which is 16,232. Do all this, you will get annual net cash flow. All these are future value terms. So multiply discount factor, you will get present value. All these are present value of cash inflow. Adding all this, you will get total present value of cash inflow to be 20,60,440. Minus present value of cash outflow you do, you will get 16,60,410. Yes, sir. Now, which option should you go for? The one with the lowest NPV or highest? This is equal life. That means we can do straightforward decision. This is giving 1660. The previous option gave you only 1640, which is giving more. Second option, that means you will select what? What is the decision making? Select option B as it has higher NPV. That's all this is. Done, no? Easy? Okay. Yes, the next one is a theory question. So yes, with this MTP question also is done for. Thank you. Well, hello people. So today is the final day where we have completed our FM marathon session. Okay. So to the best of my knowledge, whatever limited knowledge I have, I've tried my best to put it across. Okay. Hopefully that particular session was helpful to you. The video will also is uploaded on YouTube. So yes, you can take the help of it. One is that. Sir, I feel now whatever possible best from my end, I have tried and I've tried to put it across. Now, the picture, the ball is in your court. Okay, now you will have to take it. Okay, so first few things about examination is, sir, expect the paper to be lengthy. Expect the paper to be lengthy or tricky or maybe both. All right. This is common. One paper in every group will be lengthy, tricky or more. Which one we don't know. It goes attempt to attempt. They keep changing it. One or two new questions will always come. Okay. If FM ka paper is for FM ka paper is for 50 marks, go ahead with the expectation that at least 10 to 15 marks will be new. New question will be framed by default. Every attempt this happens. Doesn't matter how many RTPs, how many MTPs, how many ever previous year questions you do, 10 to 15 marks will come as a new question. But you don't freak out just by looking at this. There is also a choice. One question is a choice question, right? So you always have an option. Sir, if this 10 to 15 question is different, means almost 30 to 35 questions, 35 marks will be more or less from our ICI material and previous RTPs and MTP questions. Now you need to focus your time and energy on this. Try to score heavily here. Okay, don't do any silly mistakes here. Manage your time. See how much time you are taking. Watch out for that. In this, sir, if you do it properly, there is a scope. Sir, FM and all is a topic where if you do proper working notes and all, you will get full on full. There is a chance in this 30, you can get more than 25 also. We have seen students get that. Okay, FM is a paper. It's a scoring one. If you get 25 means automatically here, sir, what will happen? Here, if you get good marks means the confidence level will increase. If confidence level is increasing means this one, though it may be a new adjustment, kidney will work faster. Something will click. Some faculty ka, some things ka, some friend ka, something will click. You will write some garam masala. Instead of getting 2 to 3 marks, you may end up getting 5 to 6 marks also. That way in the whole paper, this is only for FM. All right. Instead of getting overall 40, 45, 50, you may end up getting 60, 65, 70 also. That is how you reach that exemption. Okay. You need to focus your energies here. It will come 15 minutes when they give you the paper. Kindly review the question. See what questions you are comfortable. How many questions you can solve. Prepare the order. In what order I will solve the question. It's not necessary you have to solve first question first only. You can solve in any order. Okay. So solve all the questions in the order you feel you are confident about. Okay. But watch out for the time. Make a timetable and see, just keep a watch out of the time, and after every question, after 10-15 minutes, make a point to review your watch to see how much time you are taking and all that. Okay. If time has passed means leave that question. 1 or 2 pages, you leave it blank and move on to the next question. Don't waste your too much time and energy there, because first focus should be to complete your paper. 100% ideal, at least 90 to 95% of the overall paper you should attempt. That should be the first priority. Because if you attempt only 50% or 60%, how much marks you will get? You'll end up getting 30-35. So first priority should always be to attempt the paper as much as possible. Minimum 90% I would expect you to attempt it. Okay. So you do all this activity in the first 15 minutes. Okay. This is one. And don't freak out by looking at the new question. Go with the anticipation that 1 or 2 new questions will definitely come. That is okay. So when you already anticipate that and go, and when you see a new question, this will not become pressure cooker. This will be like, okay, I knew that 1 or 2 new questions will be there and it came. It's fine. I will focus on this first and then I will see what best I can do in the other questions. Okay, this goes for every, this is not just for FM. This is a common pointers for almost every topic of CA, I mean, whatever, whichever level of CA examination as such. Okay, sir. One is that. Second one, I personally feel is you should definitely have one timetable, sir. Whatever time is available with you right now, make one timetable. Don't look at 101 YouTube videos. So how to make timetable, how to write. I will take A5 sheet paper, big one, I'll go on writing. Don't waste your time in all that creativity. It's a very simple thing. Just check how much time is available with you, how much syllabus you have to complete. If 10, let's suppose you have 40 days available with you. If you have 40 days available with you, let's say you're writing one group. Ideally, you should study once to clear the examination. Once study, one revision minimum according to me is required. If you have 40 days, I would devote 8 to 9 days per subject. Okay. So if you take probably 9 days, 9 threes are how much? 27 days. So in this 40 days, 27 days I will use to study the syllabus. 13 days I will use to revise. Many students, what they do is if they have 40 days, entire 40 days they will use only for study. Sir, it is a proven fact. It's a proven fact that if you don't revise, it will not be retained. No matter what, right? Even if you have studied 2 days or 3 days before also, right? You will not be able to retain it. If you want your memory, if you want on the examination day to recall the things, to recall the formula, all the concepts to come back to you, revision is a must. Okay, the more and more you revise, the more and more your memory will be able to retain it. They say psychologically, okay, almost everyday basis, we lose 15% of our memory. Whatever information we have gathered on a particular day, no? Almost 15 to 20% of that information we will lose every day. Tell me yesterday what color shirt you wore? Yesterday only. What color you wore? It took some time. Yes or no? Right? If I ask the same question 15 days back, what color shirt you wore? Don't know. Why? Your favorite shirt only you must have worn. No. You might have bought it so nicely. Yes, no. But still, do you remember or you've forgotten? You've forgotten. But do you forget to brush your teeth? Do you forget to eat? Because you do that once or every day? Every day. So it has got into your muscle memory. When you're riding a bike, do you remember to ride a bike, to put a gear, clutch and all, or automatically it will happen? Automatically, if you go into water, means your hands and legs will start flapping. Yes or no? You'll start doing this. Yes. Why? Muscle memory. So if you want the things, to come back to you, you need to revise. The more and more revisions you do, the easily you'll be able to recall. So whatever days you have, kindly not only spend time in studying it, but also give some time for revision also. At least one revision in my view is absolute must. Make that plan. Okay. So like this, and don't leave it at like this. Okay. Sir, I have to study for 9 days. I will study FM and SM for 9 days. Not like that. FM, you have to drill it down further. You'll have to complete FM and SM in how many days? 9 days. Okay. That means in this 9 days, probably you may want to use 5 days for FM and 4 days for SM. And FM has how many topics? 9 topics. Sir, 9 topics if you have to cover in 5 days means maybe I'll have to do 1.5 to 2 topics every day. Like this. You should have a daily targets. You should have hourly targets. In this particular hour, I will read this many pages. In this particular hour, in 1 hour, I will solve 4 or 5 questions. Like that, you should have the target. More and more when you have this target and when you fulfill that target. Suppose you made a target of covering 2 topics in a day. You finished it. How will you feel about yourself? You made a target of 2 days. If you finish the target for today means you will feel bad or you feel proud of yourself. Confidence will increase then. So that's how you need to make the targets. Bring a smaller target. Okay. If you say I'll study all the things in 3 months, that is too much. Your mind will not be able to take it. It will become pressurous. So make hourly targets, daily targets like this. And overall target, how in one subject I have to finish in how many days. Like this, go on measuring it. Okay. Whenever you fulfill the target, take a break. You don't have to study like crazy. Okay. Study for 1 hour, take 5 minutes break. Okay. Convince your mind. Okay. If I study for 1 hour, I will get 10 minutes break. So you are telling your mind, I don't have to study 10 hours now. I don't have to study 10 hours. I just have to study 1 hour. After 1 hour, I will get 10 minutes break. I'll scroll Instagram. That means Instagram should be your WhatsApp. That scrolling your Instagram should be your motive. To study 1 hour. If you study 1 hour, 5 minutes of Instagram time. If you don't study, no Instagram. No food. Best. No food. Okay. Alright. Like it should be as, sir, if you want something badly in life, no, you will have to set some severe goals. It's your own goals, sir. If your own goals, if you don't satisfy, means who will do that? Correct? No. See, who set the goals? You. If your own goals, if you don't satisfy, automatically the confidence in yourself will fall down. So the more and more goals you set, the more and more goals you achieve, confidence will increase. Then you will start aiming. Now if you start aiming bigger goals, at final level, now next you will say, I will write both the groups and I will get a rank. That confidence will come because you have started this process. If you don't set a goal and if you don't achieve your goal, and next level also you'll be saying, I'll write group wise, I'll take it aram say. Lethargy will come. You need to set higher goals. If you want to achieve bigger things in life, you need to have a bigger picture and not just plan for it, execute on a daily basis. Daily basis means you have to study. How many hours you have to study, you decide now. You made the timetable, no? Based on the timetable, you figure out whether I have to study 10 hours a day, 12 hours a day, 14 hours a day. It doesn't matter. Now it is not the time to count the hours. And please, whenever you are studying, devices, keep it out. Keep all your mobile and all that, especially mobile, put it on silent mode. Okay, if you're watching, suppose classes on mobile, turn off the notification for all the apps. Best, I would say, uninstall it. Next 1 month, uninstall the apps. It's okay. I'll tell you one secret. If you uninstall Instagram or Facebook or whatever it is, after 1 month, you can install it back. It's not a permanent thing. After 1 month, they will allow you. Okay, they will pakka allow you. I can give you a guarantee on that. Okay, so it will come back to you. So it is okay. Focus right now on the priority. Okay, Instagram will always be there. Okay, your friends will always be there. Your girlfriend, boyfriend will always be there. Sorry, exam also will always be there. But we don't want to write it every time. Correct? No, it will be there. You would like to write it every attempt. No. Exam is not an activity which we like to write it every time. Okay. My funda is very simple. I keep saying this. From your kindergarten, first standard, second standard and all. How many times have you failed? Did you fail first standard? Did you fail 10th? 11th you failed? BCom you failed? Why fail in CA? Why change the trend? We are CA students. Accounting policy should be consistently followed. What is our policy? Our policy is to pass. And I will pass. And to pass, I will do whatever is required. I will study. If I have to study for 14 hours, I will sit for 14 hours. No complaint. Stop complaining in your life. Regret will not give you anything. Okay. Whatever time you have, do that. Best possible way. Okay. So don't lead your life in these things with the regrets. I say this. Have you seen a river flowing backwards? Or I see a big mountain. So I will not go like this. I will go back. Have you seen like that? No. River will always forwards. Like that. In your life also, you should always do the forward march. Don't worry about 1 month I wasted, 2 months I wasted, I did not attend the class. Whatever has happened has happened. Can you do anything about that? No. So don't worry about what has already happened. Focus on the things that you can do. How much ever time you have, plan. It's okay. Yes, 40 days is there means 40 days is good enough. You will be able to crack the examination. First and foremost, you need to believe in yourself. Self-belief is a must. Okay. Think it's okay. Whatever happens, doesn't matter. Some questions are difficult. No problem. Don't curse yourself. I'm not getting only I am the dumbest person. It is okay. Just convince yourself. I'll try my best. Once more, I will review this question. Once more, I will try to revise this question. Next time when you revise the question, you will not know the same amount. You will know a little better. Like this. So focus on the improvement. Okay. And a few more things is about the syllabus. I will not comment. Okay. It's anyways, you figure it out how much time you have and how much you can cover in this particular time. As much as possible, try to cover up. In case you feel, okay, some syllabus, some topics, some concepts, I don't have time to review, it is all right. ICA is not expecting you 100 on 100. What is the passing percentage? 50. 40 in one paper and aggregate mein 50. Means what? Sorry, 100 mein you can't score 50 here. ICA is not kept 100%. They only kept 50%. So it is okay. Even if you have skipped a few topics, believe in yourself that it's okay. Somehow, whatever I know, I'll try to answer it properly. I'll revise the things that I know more often and I'll try to write it with more accurately and get more marks. So focus on that. Let your energy and things, mindset always be positive in the next, till the examination day. One more thing, especially I've seen many students do this. After writing first paper, don't do that auditing. Oh, this question, I wrote like this, so I will get this much marks. After that paper is over, throw it. Literally throw it. You can download it later from ICA website. It is there. Okay. Paper, you throw it. Auditing, you don't have to do. Evaluation, you don't have to do. What is your job? Writing the paper is your job. Evaluation is not your job. Evaluation, ICA is appointed somebody else. Your evaluation, ICA evaluation will not be same. It will change. And so I've seen many students say that I will get 60. They'll not even get 25, 30. Opposite is also true. It has happened with so many of our students only. They will say 30, 35 only, sir, maximum. 45, 50. Like that. So drastic difference will be there. So please do not do that auditing and write all the papers. If you have signed up for both the groups, write all the 6 papers. If you have signed up for one group, write all the 3. Just because first examination went bad, don't give up on the next examination. Don't think that first examination I didn't do well, or I will next exam anyway pochi. Okay, I'll not be able to clear. Don't ignore that and don't consider that and skip that next paper. It's okay. If you have signed up for 3 papers means write all the 3. It doesn't matter how the paper went. After all the 3 papers or 6 papers is gone, you can do that evaluation and figure it out. Then you can regret if you want. But don't regret during the examination. Write all the papers that you have signed up for, because you never know, sometimes Vastu will be in your side. Yes, people, so many students we know exactly get 300 and pass examination. Dot 300. Both the groups. Okay, some we have seen getting 148 in one, 152 in one. Got set off and got a 300. Like that also we see. We don't know how it works. Our lucky stars, who knows, sir? You might have done some good punya karma in your life. That karma may come back to you in the form of examination. We never know. So write all the papers. Let it be. Let it happen. Whatever happens, let it happen. You will write all that way. Okay, give your best. That's what I would say at the end. Efforts is what ultimately counts. Give your best. Let's hope for the best. Okay. So with this particular mind, and probably also focus on the health. No junk, please. Cut off as much as possible. Avoid the oily food. If you're staying in PG, stick to the normal foods. I know normal food in PG, how it's going to be, but still, it's okay. Watery dal only you have. No problem. But don't go into that too much of vada, gira, that to this and all, junk food, because last thing you want is skipping the examination because of health condition. We don't want that. Next few days, completely focus as much as possible. Get some sunlight. Do some 10-15 minutes workout. Keep this clean. Whatever, meditation, yoga, whatever works for you, whatever gives you that freshness, do that. Your activity. Okay. For some many people, many activities freshens them. You figure out what it is and accordingly do that. Okay. Try your level best. I'm pretty sure that you guys are more than capable enough to handle and clear this examination. I believe in you. So it's a matter of time that you believe in yourself, and let's write and let's rock. And next time when I see you, hopefully this will be at CA final level. All the very best, people. Take care.